Happy morning, people. Oops, okay. All right. So welcome to the first session of our CA Intermediate Financial Management Marathon. So as we've told you, we'll be doing this particular session in Coimbatore for about 3 days. So morning 7 we start, we can go up till 3:34 or something. So leave the ending time to me, it might get a little extended. Okay. So before probably I will dive into the marathon, I'll just give you a quick overview as to what we'll be doing in this particular session. So first off, before that, so thank you for the amazing love and support you've been showing for advanced accounting and our previous FM marathon. Amazing, super duper love and support. It's adding a lot of pressure to us, obviously, but really, it feels good as well. So this attempt also will try to probably keep up the same momentum, if not better it. Yes. So thank you for that. So I think once we start the session, usually we get the queries like, sir, we'll be doing all the concepts, etc., of this marathon with the help of this colored chart book. So many students will say, where do we get this chart book from? If you want to buy our classes or for that matter chart book, you can visit our website. Once you go to ArivuPro.com, you'll be able to see something called ArivuPro online over here. Click on that and this page will pop in. There you have all the courses. The courses, the books, everything is available on the website out there. If you are interested to buy, you can buy it from there. Yeah. All right. Having said that, so now this particular marathon ka overview, what we're going to be doing. People in about 3 days, what we are planning to cover is all the FM. We know that mostly is driven by the formulas and formats. So we're going to revise all the concepts once. Okay, and then take up the questions and then apply that in a few questions. Questions will be based on a particular time. If we have time for each particular topic, I'll have a certain target in terms of hours, 2 hours, 3 hours like this. If we have more time, we will do more questions. Less time means little lesser problems. So that's the problem part. We're going to keep it based on the time. But concept, we're going to be covering everything. Is that okay with you? So overall, in about 3 days time, we should be able to cover everything. And last session, on the third day, we'll try to cover the RTP and MTP of this particular attempt as well. And that will be the Tathastu. Fine. So then we'll wind up. Okay, people. All right. So first of all, thank you for coming on time. So yeah, we started sharp 7. So at least we'll try to wind up a little early. All of you woken up, Paka. All right. Fine. That's good to see. I think here, waking up is not a problem in Tamil Nadu belt, I think, na? Post 5 o'clock, I think you automatically wake up. I think even if you want to sleep, it's a little difficult, I think. Yeah. So even the sun automatically wakes you up. Hey, how very get up that times. All right. Fine. That's good thing. In Bangalore, mein ulta case. People sleep till 9 or 10 or sometimes 12 also. We'll have to literally wake them up. Hey, you wake up times. Okay. So we'll be starting with the first topic over here, people, and that is cost of capital. Right. Okay, so let's run through this. Sir, cost of capital means, sir, capital in FM means not your equity share capital, preference share capital. Capital in FM means the long-term source of finance. Now, to run a business, we need money. From wherever we source, we take up that money. From what source we can raise the money? Or from what and all we can pick the money? One, we can raise the money through equity share capital. Another one, preference share capital, or you can take bank loan, or we can issue debentures. So whatever long-term source of finance we have picked up the money, the company has picked up the money, we call it in FM as capital. Okay, capital here simply refers to long-term source of finance. Now, will anybody give any money at free of cost? Will banker give the money at free of cost to us? No, there will be some cost. So every source of finance will have a cost. So this particular topic scope is simply to find out cost of each long-term source of finance. So basically in this particular topic, we have to only find few things. Cost of equity share capital, cost of preference share capital, cost of debentures, and overall cost of capital. Overall cost of capital means if you need money, will you pick money from one source of finance or multiple source? Multiple source. So we find average cost, that only we call it as what? Overall cost of capital, denoted by the symbol KO. And one more thing, we have to find something called marginal cost of capital, MCC. These are the only few areas where we need to find out, or this topic scope is all about. Fine. Next, if you'll have to look at the meaning. So cost here refers to not the actual cost, but the return expected by the providers of finance. Now, if you take money, if the company takes money from equity shareholders will expect a return, right? That expected return only is what we call it as cost here. For an investor, it's a return. For a company, it is a cost. For an investor, it is a return. Like if I take a bank loan, for me, it is interest paid, which is a cost. For a banker, it is interest received, which is a return or an income. So here, cost of capital simply means the return expected by the providers of finance. Now, first question may arise, sir, why should we find this cost? Like here, suppose company has issued debentures worth how much money? 10 lakh. What percentage debenture? 10%. Isn't this 10% only cost? Isn't this 10% only cost? Because how much interest company has to pay on this debenture? 10%. Correct? No? So isn't this 10% cost? No, sir. 10% is not the cost over here. Why? Sir, on debentures, when the company pays debenture interest for what? For a company, it is what? Income or expense? Expense. On all your expense, you get something called tax benefit. Hence, cost of debt will not be equal to 10%. It will be different, something different. Like just to be put up a scenario over here. Let's say EBIT. What does EBIT mean, sir? Earning before interest tax. Now, let's assume two cases. One when there is interest. One when there is no interest. Now, how much is EBIT? 1 lakh. How much debentures you have issued? 10 lakh. What percentage interest rate? 10%. So, calculate how much is the interest rate? 10 lakh ka 10%. How much is that? 1 lakh. Correct. For simplicity purpose, I have just simply taken it as 10,000. Just for an example sake. How much is EBIT? 1 lakh. How much interest I have assumed? 10,000. That means from EBIT, if you reduce interest, what are you going to get? Earnings before tax. How much is that? 90,000. From this, reduce tax at 30%. 9 3s are 27. So, how much is the tax amount? 27,000. So, how much is your earnings after tax? 63. Correct? This is the number when there is debentures, meaning when there is interest. If debenture is not there, when will interest come or interest will not come? How much is EBIT? 1 lakh. Now, how much is interest? 0. I mean, check what happened to your EBT. 1 lakh. What happened to your tax, people? 1 lakh ka 30%. How much is the tax now? 30,000. What happened to your EAT or earnings after tax? 70,000. Concentrate on this number. When interest was there, how much was the tax amount you paid to the government? 27,000. When interest is not there, how much tax you're paying to the government? 30,000. That means what? When interest is not there, tax increased by 3,000. Do you agree with me? That means how much tax you are able to save because of interest? 3,000. Because of interest, you are able to see from 30,000, now tax's amount is only 27. How much tax you saved because of interest? 3,000. This is what we say by on debenture or on debenture interest, you get something called tax benefit. Now you honestly touch your heart and tell, though you are paying 10% interest, are you also not getting some tax benefit? On one hand, you are paying 10% interest. On another hand, you are getting some benefit. So is the cost really 10% for the company or something lesser? Hence, each source of finance cost we need to find out. It is not direct. That's the logic. Understood? This is not required for exam, just for the sake of our understanding. Yeah. So far, everybody good over here? Sir, though it is a marathon, I'll have frequent recaps with you. Would you be okay with that? Comfortable now? Okay. Cost of capital. Tell me, sir, what does cost of capital mean? Long-term source of finance will have a cost. That cost only we are trying to find here. So effectively, how many instrument cost we need to find here? Cost of equity shares, then cost of preference shares, then cost of debentures, then one more is there called cost of retained earnings, then overall cost of capital, and then MCC. MCC as in marginal cost of capital. So how many? 6. And cost here refers to the actual money paid or return expected. Return expected by whom? The providers of finance. Whoever is giving the company the money, how much ever return they are expecting. For them, it's a return. For a company, it is a cost. That cost only we are about to find out over here. Okay, Sarchi. Now let's dive into the first instrument. First instrument is long-term debt. Long-term debt, we call it, is denoted by what symbol? KD. KD. Okay, people. Now, cost of debt. Anybody remembers formula? Cost of debt. In order to first find the debt, we need to check whether the debt is a redeemable debt or a irredeemable debt. Redeemable debt means within a certain amount of time, the company has to repay. Like bank loan. Once you take a bank loan, can you keep it forever or you have to repay it? If you take a bank loan for 10 years, then company has to repay within 10 years. So if you have a term, if you have a fixed duration, we call it as what sort of a debt? Redeemable debt. If the term is not there, then it becomes what? Irredeemable debt. Now, if it is irredeemable debt, cost of debt is given by the formula. Tell me, let's see. It's a marathon. You must have already prepared once. So, cost of debt is given by what formula for irredeemable debt? KD is equal to interest. Interest or on interest you get tax benefit. So, hence what do? We don't take interest in the numerator. It will be interest into 1 minus tax rate divided by the net proceeds. A simple way to remember this formula is payment divided by receipt. What? Payment divided by receipt. What is company paying? Interest. What is company receiving? Net proceeds. When the company takes a bank loan, company will pay the money or get the money? Get the money. Hence, a simple way to remember the formula is payment divided by receipt. But we can't take interest in the numerator. Why? Because on interest we get some benefit called what? Tax benefit. Hence, instead of interest, we take interest into 1 minus tax rate divided by net proceeds. Pakkana ji? Alright. Next to net proceeds. Sir, what number should we take as net proceeds? That depends. Depends on what? Whether it is an existing debt or a new debt. Whether it's an existing debenture or a new debentures. If it is new debentures or a new debt, first priority we will give it for IP. IP as in issue price. If IP is missing, issue price is missing, then we'll take up market value. Market value also missing, then we'll take face value. This is for new debt. If it is existing debt, first priority for market value. Market value missing, face value. Doesn't matter which number you take here, one component you have to compulsorily reduce. What is that? Flotation cost. You have to minus your flotation cost. Flotation cost means, name itself is saying flotation cost. To float the instrument or to issue the instrument, whatever cost we are incurring, that we call it as flotation cost. Now, when you want to take a bank loan, bank will process your document. For that, they charge some processing fees. All that becomes your flotation cost. So basically, to take this money, if you are incurring any expense, that becomes flotation cost. Doesn't matter which number you take, flotation cost has to be compulsorily reduced. By doing this, finally we get number. What is that number we get? Net proceeds. This is a formula for what, people? Cost of debt in case of irredeemable debt. Now, the next component. What is the next component? What is the cost of a redeemable debt? Redeemable debt means it will go on forever, or after some point of time you need to repay. After some years you need to repay. That could be 3 years, 5 years, 15 years, whatever. Question will specify. Tell me, how do you get cost of the redeemable debt? What's the formula? First part is same, or a simple way. What is a simple way to remember the formula? Payment divided by receipt. Okay, next. What's a numerator? Fill me up. Same as the previous one. Interest after tax interest. So you will do what? Interest into 1 minus tax rate plus RV minus NP divided by N, whole thing divided by RV plus NP divided by 2. Now what is this? What is this RV? Anybody remembers? We had discussed logic in class. RV is your redemption value. Now let's say, people, company is redeeming the debenture at 110 rupees. Company is redeeming the debenture at 110. You know, redemption can happen at par, premium or discount. Let's say net proceed was only 100. How much was net proceeds? 100. That means company borrowed from the debenture how much money? 100. But they're repaying 100 or 110. So that means company is paying same or more. How much more? 10 rupees more. If company is paying 10 rupees more, means for a company it is a benefit or cost. Hence this also be what? That means here company is incurring two costs. One in the form of interest. Another in the form of, this only we used to call it as premium on redemption of debentures and accounts, if you remember. Everybody okay now? Everybody good. Okay. Now this particular 10 rupees what the company is paying extra. This particular 10 rupees what the company is paying extra. It is for 1 year or term of the debentures. This is for the term of the debenture. How much number again we'll take? Let's say the term of the debenture is 5 years. That means how much is this number, sir? Calculate this for me. 10 rupees is the extra amount for 5 years. On average, 1 year, how much extra? 2 rupees. So that is what we take over here. Clear? Huh? Everybody good with this so far? Now tell me, this number is pakka actual number or average number? Average number. Since the numerator is average, mathematically if you want to compare, if numerator is an average, means denominator also should be average. Hence denominator also, the formula is not proceeds, we take average. We have two components, RV and NP. How do you find average of that? RV plus NP divided by 2. This is the formula and the logic for it. Tell me once again the formula. For if it is cost of debt, irredeemable debt, what is the formula? Irredeemable debt. Interest into 1 minus tax rate divided by net proceeds. And if it is redeemable, interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Okay. And there is one more catch in this formula we discussed in class. Now, why do we do 1 minus tax rate? Because on interest we get tax benefit. On interest we get tax benefit. Suppose the problem says this is also cost, no? On this also, if the problem says we get tax benefit, what are you going to do? On this also, if this premium, no? On this also, if company says, if the question says we get tax benefit, what do you have to do? You have to multiply 1 minus tax rate to this also. Okay, and I think in this one of the RTP made this attempt came. Till now that adjustment was not tested. I think now it came. I think we had discussed in class with formula it was there, but just say. So if on this also, if there is a tax benefit, we will multiply simply 1 minus tax rate and do the number. Done, Aji? Okay. Any doubt so far? Can we follow the same pace? Would you be okay? Since it's marathon, I'll have to speak a little faster. I hope it's okay with you, because I don't want to make it as a too much rubber also. So like that. Okay now with this so far? Done. And one more thing. How do you get net proceeds? That depends on what? Whether it is an existing debt or a new debt. If it's a new debt, first priority, issue price, IP. If IP is missing, market value, that is also missing, face value. If it is an existing debt, first priority, market value, that is missing, then you will go for face value. Doesn't matter what number you take, flotation cost has to be reduced. Then finally only you will be able to get net proceeds. Now these two methods, we call it as approximation method. These two methods we call it as approximation method. There is one more method. What is that? IRR method. IRR method. IRR means what, people? Full form is internal rate of return. Sometimes they also call it as implicit rate of return. IRR is a rate at which present value of two things will be equal. What are those? Present value of cash inflow and present value of cash outflow will be same. Or IRR is basically a rate at which your NPV is 0. Now what is IRR ka formula? What is IRR ka formula? All of you, we call this as interpolation formula. What is that? In IRR, first of all, what do we do? Walk me through. We'll assume two rates. Is it mandatory to assume a specific rate or our choice? Our choice. We assume two rates. Ideally, I'd like to keep a gap of 4 to 5%. Like first percentage, if I assume 10, next percentage, ideally I'll assume 14 or 15, something like that. But is it mandatory or your choice? Your choice. So assume two rates, then apply interpolation formula. What is interpolation formula? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower. Fine, people. So by plugging in the formula, you will get particular number. That particular number only we call it as IRR. That IRR only becomes what, sir? Cost of debt. As simple as that. Correct? Now once we will apply if you want one problem, but maybe once we can go through. Okay. Now tell me, people, IRR. IRR is a rate at which two things are equal. What are those? Present value of cash inflow will be equal to present value of cash outflow. Outflow will happen later in now only. Outflow will happen now. Now in FM we call it as what? Year 0. Year 0 means now. Done. Alright. In fact, I told you, remember, for IRR we put the positive negative. Inflow we show it as positive, outflow we show it as negative. This positive negative sign, we put it from company perspective or investor perspective. This positive negative, I told you in class that put it from the investor's viewpoint. From the investor's viewpoint. Now think, I am the company, I have issued debentures. I am the company, I have issued debentures to you. Will I issue the debenture certificate to you at free of cost, or you have to pay me the money? You have to pay me the money. When? After 5 years or immediately? So at immediately for you, there will be an inflow or an outflow. Outflow. But for me, that is net proceeds. For me, that is a Net proceeds. So at year 0 mein what you will take? Net proceeds. As what number? Positive or negative? Negative number, because we put this sign from whose perspective? Investor's perspective. From investor's perspective, when you buy my company ka debentures, for you it is an outflow. Hence the sign is what? Negative. Done na? Now every year what are you going to get because of debenture? Interest. Yes. But now this IRR calculation is done by the company or investor? Who is doing this calculation? Company only, right? Company will take interest or after tax interest. So for year one, let's suppose it's a term of the debenture is 3 years. Term of the debenture is 3 years. Will you take only interest or after tax interest? How do you get in FM a number on after tax basis? If you want to get something on an after tax basis, we simply multiply what? 1 minus tax. Hence we do interest into 1 minus tax rate. 1 year or every year? Every year. How many years I have assumed here? 3 years. So for 3 years you will take after tax interest. Third year mein what will happen? Third year mein redemption will happen. So company will pay the money, investor will get the money. Now I'm putting positive, negative from company perspective or investor perspective. From investor perspective, at the end of third year, you will pay me the money or get the money. So outflow or inflow? Inflow. So third year mein you will not only get interest, but you will also get RV. RV as in redemption value. Now this is your cash flow. Now assume any discount factor, 8%, 10% or whatever, and calculate NPV. How do you calculate NPV? All these are present value of cash flow. All these are present value of cash flows or future value of cash flows? Future value. In FM, how do you get something on a present value platform? Take the future cash flow and multiply by the discount rate. These two, if you multiply, automatically you will get the present value. This is what? First number is what? Present value of cash outflow. What are these number? Present value of cash inflow. So that means what? When you add these, when you add this, if it exactly becomes 0, that is what? IRR. That is what? IRR. But do you think here you will be so lucky? No. IRR you will usually be in decimal. So it may be like 10.85 blah blah blah. So when you take a number, you will get, let's assume at 10% you got how much NPV I was you? 500. Now is this 10% my IRR? No. If 10% was IRR means NPV should have become 0. In my example, is it 0 or 500? Now we'll have to assume one more rate. Okay, na sir? Now in simple trick in FMS, now from 500 it has to become 0. So NPV we have to increase or reduce. NPV 500, from 500 we have to make it 0. So we have to reduce. If you have to reduce NPV means we'll have to increase the discount factor. As you increase the discount factor, NPV value will go on reducing. That means next discount factor I'm going to assume a lesser number or a higher number. Higher number. Let's assume I've taken it at 15%. When I did the same calculation at 15%, suppose I got it to be negative 50. I've got how much? Negative 50. So is this my IRR? Is this my IRR? No. If this was IRR means NPV should have become 0. Is it 0 or negative? That means IRR is somewhere between 10 to 15%. Somewhere in between this IRR exists. How to get that? Simply by plugging in these numbers in this interpolation formula. Lower rate. What is the lower rate here, people? I've assumed two rates, 10 and 15. Which is the lower rate? 10%. At 10%, what is NPV? 500. So that is your lower rate ka NPV. Divided by what? NPV at lower rate minus NPV at higher rate. Which is higher rate here? 15%. At 15%, what is the NPV I've got? Negative 50. I have to reduce it. I have to reduce. And the number is already negative. Negative of negative will become positive. Into higher rate minus lower rate. What is higher rate? 15%. What is lower rate? 10%. Plug this number into the formula. Automatically you will get a rate that is only IRR. That only becomes cost of debt. Done, people? It was simple walkthrough. We will spend time like this so that if you have understood, we don't have to solve any question. We can leave it here only. If you're feeling, now let's do one questions. We will do it provided we have. But every concept will keep revising and formula will keep revising like this. That's okay with everybody now? Done. This is what people, till now what have we covered? First we have covered, first instrument. What is that? Cost of debt. Cost of debt. Debt here means what? Bank loan and debentures. Everything. Everything becomes, in FMA we call it as debt. This is sorted. Can we move on to the next page? Next. Some 5-6 pages are there. If you cover that, conceptually it will be over. Then we'll move on to the numericals. Next to people, one more thing, in fact, if you have a convertible debentures, if you have a convertible debentures means what? Will this debentures be repaid in form of cash? Let's say the term of the debenture is 10 years. Term is 10 years. At the end of 10th year, will company give cash and redeem? No. The debenture will get converted into equity shares. Yes, no? That means how much is redemption value? Because are we paying cash here or shares? That means we need cash value or share value. Now you need to check the problem over here. If it is convertible debentures, first you will ask one question. What is it? Whether it is a compulsorily convertible debentures or optionally convertible debentures. Whether it is compulsorily convertible or optionally convertible. Optionally convertible means? Optionally convertible means investor has a choice. What choice? Either to take cash or to take shares. Either to take cash or to take share. Now you tell me, if I've given you a choice of cash or share, you will take the lower benefit wala option or higher benefit? Higher benefit. That's what this particular problem says. If it is optionally convertible debentures, we have to find redemption value of two components. What is that? Redemption of cash option and redemption value of share option. You'll choose the one which is lower or higher. Higher of the two, whichever is higher, that becomes your redemption value for our formula calculation. This is for what? This is for what? When it is optionally convertible. If it is compulsorily convertible. If it is compulsorily convertible, that is company giving a choice to investor or no choice? Now do you need two option ka redemption option or only one? Only one. What is that? Cash. Then if it is compulsorily convertible debentures, then we'll take redemption value of only what option? Share option. Both the types of problem we have done in our regular class. I hope you remember. Maybe if time permits, one problem I'll take you through this also. This is also good adjustment, so watch out. Do not forget to remember one subtle small adjustment here, which is what? Whether it is optionally convertible or compulsorily convertible. Only if it is optionally convertible, you will find two redemption value. What are those two redemption value once again? Cash option ka redemption value, share option ka, and take whichever is higher. If it is compulsorily convertible, then is investor getting a choice or only one choice? One choice. What is it? Shares only. That means in that case, you will find redemption value of only share option, and that only becomes RV as in redemption value. Now, next one, KP. KP means cost of preference shares. Sir, is cost of preference shares ka formula different or same? Same. But the only thing is, interest is an expense. Interest is a expense. On expense, we get tax benefit. But is dividend an expense or appropriation? Appropriation. Tell me the order. From EBIT, first you will reduce interest. What are you going to do? What are you going to get? Earnings before tax. From that you reduce tax. What are you going to get? Earnings after tax. Tax is already paid. Tax is already paid. Now you are paying what? Dividend. Now you are paying preference dividend. Now tell me, because of preference dividend, is there any impact on tax or no impact? Because tax is already paid. So on preference dividend, equity dividend, will we get tax benefit or no tax benefit? If there is no tax benefit, is multiplication of 1 minus tax rate required or not required? Not required. That means substitute wherever your cost of debt was there. No, from interest you will substitute with dividend. 1 minus tax rate you will consider or you will not consider? Tell me the formula. What is cost of preference shares ka formula? Again, first you need to check whether it is a redeemable preference shares or irredeemable. If it is irredeemable, simple way to remember the formula is what? Payment divided by receipt. On preference shares, what will the company pay? Preference dividend. So tell me the formula. Preference dividend divided by net proceeds. Preference dividend divided by net proceeds. For what? Irredeemable. If it is redeemable means preference dividend plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Okay, now what about NP? What about NP? First priority for NP will be, again that depends on what? Whether it is an existing preference shares or new preference shares. If it is new preference shares, first priority for issue price. Next, if IP is missing, then market value. That is also missing, face value. Existing preference shares means first priority market price. That is missing, face value. Doesn't matter what you take, flotation cost you need to reduce. Anything new or same as debt? Same as debt there. Okay, perfect. Alright. Or these two methods, what do we call it, people? Approximation method. If you don't want to go for approximation method, we can also use what method? IRR method. Done, Aji? And sir, in exam, how to find out? Question will specify. If question doesn't specify, you will go for IRR or formula. Go for formula because that it will be less time consuming. IRR will take more time. So unless the question says IRR, don't use IRR. More time it will take. Now walk me through IRR. Went you through. Went you through that. Took you through that table. Same way for preference shares. Construct a table for me. What you will take? What is the table ka format? Year, cash flow, discount factor. Then present value of cash flow. For IRR, we'll take one discount factor or one more. So second discount factor. At that second discount factor, present value. Okay. Now at year column, you will start with year 0. Suppose preference shares is for 5 years. Preference shares is for 5 years. You will start at year 0. Then 1, 2, 3, 4, 5. Then 5 again. At year 0, what you will take? You will take the outflow, right? You will take what? Net proceeds. Same, net proceeds. But the net proceeds, you will put it as a positive sign or a negative sign? Negative sign. Because for a company, it is net proceeds. For an investor, it is a outflow. Hence, negative. 1, 2, 3, 4, 5. What is that? After tax dividend or only dividend? After tax dividend or only dividend? Only dividend. Which dividend? Equity na preference dividend. Preference dividend. Fifth year you have to take again RV. The preference dividend and RV will be in a positive number. Year 0 ka net proceeds will be in negative number. Like this, at two rates may find out NPV and apply interpolation formula. What is interpolation formula again? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower rate. Fine. That's all. That's about your preference shares. Any doubt? Two instrument over. What's the third one? Cost of equity shares. Cost of equity shares is denoted by the symbol KE. Since equity shareholders are like risk takers, their risk or their expectation also will vary. Okay. Now currently if you just check, market is falling too much. Correct? No. Now equity shareholders will expect very high return or they are happy with low return. They are happy with low return. Right? In recession environment, equity shareholders will expect less return. But when things are good, equity investors will expect very high return. So to find cost of equity, we don't have one method, we have multiple methods. First one is what? Dividend price approach. In name only there is formula. Dividend price approach means the formula is dividend divided by price. This method assumes that the dividend is constant. Every year company will pay same equity dividend is this method ka assumption. Next is earnings price approach. What is earnings price approach ka formula? Name only, again there is a formula. Earnings price. So numerator mein earnings as in EPS. Denominator mein price as in NPS. Now this method assumes what to be constant? EPS to be constant. Then Gordon Chacha. What is Gordon Chacha ka formula? Cost of equity is given by the formula D naught into 1 plus growth rate divided by P naught minus flotation cost. Whole thing added by the growth rate. D naught means what? Dividend already declared, dividend already paid, we call it as D naught. D1 means expected dividend. D naught is dividend already paid, D1 is expected dividend. Now Gordon Chacha is actually used the same formula, dividend price approach formula only is taken, but he made a modification there. What Gordon Chacha is saying is this dividend price approach, what did it assume? Dividend is constant. Gordon sir is saying dividend can never be constant. Now, if you get 50 marks in this attempt, next attempt maybe we will expect, or CA final maybe we will expect same, a little more. Same goes with that also. You can come in, no issues. If you're coming in, just walk in. No need to excuse yourself. Now, if you're getting 1 lakh salary now in a company in this year, next year you will expect 1 lakh only or more? More. So, the expectations of equity shareholder can never be same. It will keep growing. Hence, the growth rate, Gordon sir infused in the formula. So hence D naught you take into 1 plus growth rate. D naught into 1 plus growth rate, if you do, automatically you're going to get D1 only. Divided by what? P naught minus flotation cost. Whole thing added by the growth rate. Fine now people? This is a formula. What is P naught here again? P naught again it's the same thing. If it's a new share, first priority will be your issue price. IP missing, then market value. That is also missing. Face value. If it is existing equity shares, first priority for market price. All that drama is same. But no matter what you take, flotation cost F, we need to compulsorily reduce. Okay, Ji? And that's your formula. Either this we will use or this we will use. When will we go for this formula, people? When dividend paid is given. When dividend already declared or paid is given. When will we use this? When expected dividend is given, if D1 is given, we will use D1 ka formula. Dividend paid is given means we will use D naught ka formula. What is G over here? G is your growth rate. How do you find growth rate? We have solved multiple ways to use growth rate. Anybody remembers? One is trial and error method. Let's say first year, the first year number was 100. Second year number has become 110. That means from 100, the number has become 110 means it has increased by how much? 10%. This only becomes growth rate. Like that. That is your trial and error method. Simply to test it at various percentage. You test it in your calculator at 5%, 6% like this. That's your trial and error. Another one, future value table method. If they give you future value table, maybe one question I will take you through that once again as a reminder. You can use that. The most of the problems in our exam or in our class we have used trial and error method, if you remember. Okay. There is another one, the formula. What is that formula? In dividend decision topic, maybe we applied this. Anybody remembers? G is equal to B multiplied by R. B for retention ratio, R for rate of return on investment. If these two are given, by multiplying automatically we get the growth rate. So these are one of the ways to find, or one of the three ways to find out the growth rate. Which one you use, your choice. But any one of the things you can use. And that's your Gordon-Chachaka formula. Next to CAPM model. CAPM means capital asset pricing model. Okay, tell me sir, in capital asset pricing model, how do you get the cost of equity? RF plus beta into RM minus RF. RF is your risk-free rate of return. B for beta into RM. RM is your market rate of return. RF again is your risk-free rate of return. From RM minus RF, if you do, you get one number that we call it as risk premium. Sometimes in the problem, instead of giving RM minus RF, directly they can give you risk premium also. So watch out for that. Okay, now people, and that's your capital asset ka model. First of all, what does beta mean here? Beta measures the relationship between a particular company ka stock with market. Okay, let's say over here, just for simplicity purpose, our RBI bonds or government bond is giving how much rate? 7%. Now people, this government instrument ka rate, we call it as RF or risk free. Now government only is issuing this. Can they say this is a risky instrument? When government issues bond, and if they say that is risky, then it will be very demeaning for the government. Yes, no? So any bond or any debentures issued by the government or RBI, that is always considered as what? Risk-free instrument. Now on government bond, how much interest you will get? 7%. Let's say market is giving you 15%. Nifty, Sensex is giving how much interest rate? 15%. Government is giving how much? 7%. But Nifty, Sensex is giving how much? 15. So that means compared to the government, is market giving more return? Compared to the government, is market giving more return? How much more? Market is giving 15, government is giving only 7. How much more? 8% more Sensex is giving. Agreed? Yes. Sir, if market gives 8% return means company also should give 8% more? No, that is only measured by what? Beta. Okay, if beta is 2, what does it mean? If beta is 2, what does it mean? If the market gives 1% extra return, this company will give 2 times of that, which is 2% more. If market gives 5% extra return, then this company ka beta is 2 means how much extra it will give? 5% cut 2, which is 10%. That's what beta is trying to measure. How much extra market gives and how much extra this particular company gives. That's only your beta. You don't have to really know the formula ka logic. You need to only remember the formula for exam. What is that formula again, people? RF plus beta into RM minus RF. Sometimes instead of RM minus RF, directly they'll give you risk premium. Risk premium is nothing but how much extra return the companies or the particular market has given. Done. This is your CAPM. And now there is one more formula for your cost of equity. What is that? IRR. IRR you can call it, or you can also call it as realized yield approach. If you remember 2 problems we had done on IRR. What are those? One, if year-wise return, first you will check if year-wise return if it is given or not given. Year-wise return andre? What does year-wise return mean? Every year equity shareholders will get a dividend, no? So if suppose you are holding equity shares for 5 years, you are holding equity shares for, or let's say 4 years. First year ka dividend, first year ka price is given to you in the problem. Again, second year ka dividend and second year ka price given. Third year ka, fourth year ka also dividend price is mentioned. If that is there, means we say year-wise return it is given. Year-wise return it is given. In that case, we go for geometric mean wala formula. Anybody remembers what is this? First year return is given by the formula or denoted by the symbol 1 plus y1 is equal to what? D1 plus P1 divided by P0. Similarly, if you know 1, you can construct the other one. Second year return is denoted by the symbol 1 plus y2. Construct this for me. Second year return will be what? D2 plus P2 divided by P1. Third year ka denoted by 1 plus y3. Formula is D3 plus P3 by P2. Fourth year ka it will be D4 plus P4 divided by P3. This is usually they'll give you 4 years ka return. You will be able to calculate. So multiply all the 4 and apply what? Root button. Nth root you have to find. N year means how many years your return you are able to find here? Fourth year. So you'll have to find out the fourth return. Multiply all this number and find out what, people? Fourth root. How do you find fourth root? In your calculator, there is square root button. If you want to find this is square root. Square root means 2. TV went off. What happened now? I don't know. No. Passcode. Anybody knows what to do? AirPlay password. Tab. Nothing here also is mentioned. Okay, maybe I'll just call her up. Give me a minute. Apparently not much of a break today to us. Okay, we'll come back. Okay, so we're discussing if year-wise return is given, we calculate through a particular way. What is that first year ka return again? Denoted by symbol 1 plus y1 given by D1 plus P1 divided by P0. Second year denoted by the symbol 1 plus y2 given by D2 plus P2 by P1. Third year ka denoted by 1 plus y3 given by D3 plus P3 by P2 rather. Fourth year ka return 1 plus y4 given by the formula D4 plus P4 divided by P3. Multiply all of them and find out what? Fourth root. Why fourth root? Because we have to find out nth root over here. N here refers to number of years. How many years return you are able to find here? 4. So you'll have to find out the fourth root of this number. How do you find fourth root? This button is there in your calculators. This is called square root. Press this button twice. You'll get the number. Okay, now we have done this. So okay, I think maybe I'll talk about it when the question comes. So far, okay. If this data is not given, if this year-wise return, if it is not given, then you will go for your normal IRR method. Done, Sarji? Let's do a thing. Can we do 1 or 2 questions on this immediately? And just to be on the safer side. 1 minute, it was there, not somewhere here. And now, come to question number 13. People will not be solving the question, we'll only be reviewing it. We don't have time. Alright. Now check this. Mr. Mehra had purchased shares of Alpha for how much value? 1000. And that means for Mehra, this is an inflow or outflow? He has purchased. So that means this 1000 is an outflow. He received a dividend for a period of 5 years at what rate? 10%. How much money he invested? 1000. 1000 ka 10% is how much, people? 100 rupees. So dividend every year Mehra is receiving is 100 rupees. Basically 1000 ka 10%, which is 100. At the end of 5th year, he sold the shares of Alpha for 1128. Now you would tell me the period of holding is 5 years. Okay. But they have given dividend for 5 years. Have they given price for 5 years or not given? All the 5 years ka price given or not given? Not given. That means can we use the geometric wheel mean wala formula or IRR formula? IRR formula. So here they are asking us to find out cost of equity using realized yield approach. But we will use what now? Normal IRR wala formula. Okay, take me through rather. Columns. First what? Year, or walk me through that particular table. First you will take what? Year. Then cash flow. Then discount factor. Then present value of cash flow. We need 1 discount factor or 2. What is the discount dividend rate he is receiving? 10%. So first discount factor I'm going to assume 10%. Then this will not be the answer. I'll have to assume 1 more discount factor. Done, Aji? At year 0, tell me. At year 0, what we'll take? Net proceeds. Mehra purchased by paying how much money? 1000. For Mehra, this 1000 rupees is a outflow. For a company, it's a inflow. Or from company's perspective, we call this as net proceeds. That 1000, you will put it as a negative number or positive number? Negative number. Why? But signs we put it from whose perspective? Investor perspective. So 1000 will happen. When will the Mehra pay this 1000 rupees? Future mein or immediately? At year 0 mein 1000 will be negative. Done now. And for 5 years, Mehra will get a dividend. How much rate? 10%. 1000 ka 10%. How much is that? 100. I told you in the problem, if every year ka cash flow is same, should we have to use each year ka discount factor or club it up? That only we call it as PVAF, right? So instead of 1, we will write 1 to 5. So dividend will be 100. How do you get PVAF, people? How do you get this present value annuity factor? 1 divided by 1.1. Press equals to button 5 times. And then there is a GT button in your calculator. Press that grand total button. You should be able to get 3.7. In 5th year, Mehra sold the shares. How much money he got? 1128. That's your redemption value in a way you could say. Done. This one you will take PVAF or PVIF. What is the difference between PVAF, PVIF? Each year ka discount factor. Each year ka discount factor. We call it as PVIF. PVAF means total of many years ka discount factor. Now, when will you use PVAF? If every year, if you are getting same cash flow, then we have a scope to use PVAF. This particular 1128, Mehra is getting every year or only once? If cash flow is coming only once, means we have to compulsorily use PVIF. Which year ka PVIF you will use? At 10%, you will use 5th year ka discount factor. How do you get that? 1 divided by 1.1, press equals to button how many times? You want 5th year ka, so press it 5 times. Your calculator should show 0.6209. This is your future cash flows. Multiply the discount factor, you will get present value of cash flow. What is the rate we have assumed? 10%. Did we get NPV 0? No. If we get NPV by chance 0, then that only is your answer. Did we get it or we did not? Now assume another rate. What is the other rate? Now you tell me, sir. Now you will reduce the interest rate or increase it. Now I want my NPV from 79.37, it should become 0. So NPV I have to increase or reduce. NPV from 79.30, it has to become 0 means NPV I have to reduce. If you have to reduce NPV means discount factor you will have to increase. Now let's assume you can take 13, 14 or whatever. And when we tested at 14%, when we tested, we got it how much? 71.36. Now is 14% my IRR? No, if 14% was IRR means NPV should have become 0. It is not 0, it has become negative. So NPV IRR is somewhere between what? 10 to 15% or 10 to 14%. And plug this into your interpolation ka formula. That's all it is. Easy, no? This is pretty straightforward, no? You'll use this when year-wise return not given. When year-wise return not given. Now, can we go for another question? Now, check this problem. Question number 14. Calculate the cost of equity using realized approach only. They have given 5 years ka data. And check this number, dividend per share. And they have given price per share at the beginning. Each year ka dividend they have given. Each year ka price also they have given. Now, that means year-wise return is missing or we can find out. If each year ka price and each year ka dividend is given means we will use normal IRR formula or geometric mean formula. Geometric mean wala formula. But do keep in mind this is not price at the end of the year. It is price at the beginning. That means year, this 9 rupees is the price at the end of first year or beginning of first year? Year 1 beginning. In FMA, is there anything to represent year 1 beginning? Yeah, that only we call it as what? Not. When you use the word not, it means now. So this 9 rupees is not P1, it is P0. P0 means price at the beginning of year 1. This will be 9.75 is price at the beginning of second year. First year ka closing price will become second year ka opening price. So basically this is what? P1. This is what? P2. This is P3. This is P4. Yes, sir, people. Dividend, did they say anywhere? Like for share specifically, they said this is the price at the beginning. For dividend, did they say this is the price at the beginning? Dividend company will pay at the beginning of each year. Dividend will be paid at the end of each year, usually. Yes, no? I mean, this is what? This is D0 or D1? So D1 to D5 they've given. Clear, people? Everyone good? So now you would tell me, how many years return can you find out here? 5 years ka or 4 years ka? How many years return can you find in this problem? 5 years or 4 years? So to find 5 years return, we need 5th year ka dividend also available. We need 5th year ka price also. Is 5th year ka price available or not available? I mean, you can find the return only for 4 years. Yes, huh? So find 4 year ka return. Again, tell me how do you find this? First year ka return. How do you get first year ka return? D1 plus P1 divided by P0. Calculate once for me. Let's see. D1 plus P1, 1 rupee plus 9.75. These two you add, divided by 9 you do. How much are you getting? 1.19. Correct, Aji? Like this, we do it once or 4 years. 4 years. So you did the same. And then what? Multiply. Multiply all the 4 years ka return. Find out what? Square root or nth root? Nth root. How many years return are you able to find here? 4 years. That means which root you need to find out? Fourth root. How do you find fourth root? If you are not comfortable, if you want, you can try this in your calculator. Multiply all the 4 years ka return and press the root button twice. Press the square root button twice. You should be able to get 1.7276. Confirm that for me. Multiply all this number and press the square root button twice. Comfortable? Or if you are getting 1.7, what is that? 1.1464. That's what you're getting. Yes, no? Minus 1 you do at the end. You're going to get finally what number? 0.1464. Or rather, the cost of equity is 14.64%. Because of late, people, this is not tested much. That's the reason I've chosen to do this particular problem. Last 5-6 attempts, I have not seen this question. Something which has not come way too long are expected soon in exam. Okay, so better be prepared for those. I'm not saying this will come. If it comes, amazing. Yeah, but just say, yeah, that's a usually I see a cut trend. And this is your realized yield approach. Easy now. So with this, what have we covered? Cost of equity also we have covered. Now can we go for the next one? So far, what and all have you covered? Cost of debt, cost of preference shares, then cost of equity shares. 2 or 3 more. What are those? Cost of retained earnings, KO and MCC. Can we go for cost of retained earnings? First of all, retained earnings means what, people? Retained earnings means profit which the company has distributed or profit which the company has kept with themselves. Whatever profit company has retained or kept with themselves, we call it as retained earnings. So how do you get retained earnings? From EBIT, tell me, how do you get retained earnings? From EBIT, if you reduce interest, you're going to get earnings before tax. From EBT, if you reduce tax, you'll get earnings after tax. From EAT, if you reduce preference dividend, we get net income or EASH. EASH means earnings available to equity shareholder. Yes. From this, if you reduce equity dividend, let's say EASH or net income is how much? 53,000. From that, how much equity dividend was paid? 20,000 I've assumed. So how much profit still remains? 33,000. Has the company distributed this final 33,000 or still kept with the company? This 33,000 only, we call it as what? Retained earnings. Okay, now everybody cool? Now you tell me, this 33,000 belongs to preference shareholder or equity shareholder? Equity shareholder. Now ideally, company should have distributed how much dividend to equity shareholder? 53. Why 53? Sir, after paying preference dividend, how much profit is available? 53. So this entire 53 belongs to whom? Equity shareholder. Correct? No. So company should have paid how much equity dividend to equity shareholder? 53. Did they pay 53 or only 20? I mean, this 33,000, can I say shareholders have sacrificed their dividend in the current year for the sake of company's growth? Company is retaining this money because company is saying, I want to do expansion and all in future, so that I need money. So hence company is saying, I will not give equity dividend worth how much? 33,000. But this also belongs to whom? Equity shareholder. But did they get this 33,000 in the current year or they have not got? I mean, this 33,000 equity shareholders have sacrificed. Will anybody sacrifice an amount at free of cost or they will expect some return on this? If equity shareholders have sacrificed 33,000 now means on this 33,000 also they will expect a return. That only we call it as what? Cost of retained earnings. So equity shareholders have made a sacrifice. That sacrifice portion ka cost only we refer to as what? Cost of retained earnings. Done, Aji? That's the meaning. Now, since cost of retained earnings also belongs to equity shareholders, KR and KE ka formula any different or same? Same. Whatever formula you use for cost of equity, same formula you will use for what? Cost of retained earnings also. Walk me through. Earnings price approach. Using first dividend price approach using, if you want to find KR, what's the formula? Dividend divided by price. Earnings price approach. Earnings by price. Garden chacha. D naught into 1 plus growth rate divided by T naught minus flotation cost. Whole thing added by growth rate. Correct? Wrong. Sir, for retained earnings, flotation cost will come. Flotation cost means what? To issue the instrument, how much cost you are incurring. You can issue equity shares? Yes. Can you issue preference shares? Yeah. Can you issue debt? Yeah. Can you issue retained earnings? Retained earnings is profit. Where can you? How can you issue it? Yes. So retained earnings you cannot issue. Hence flotation cost will come for KR or it will not come. So wherever flotation cost is there, consider that or cut it off. Cut it off. That becomes your KR ka formula. Okay, tell me again, Gordon Chacha ka KR formula. D naught into 1 plus growth rate divided only by P naught. Whole thing added by growth rate. Flotation cost will not come. If they have given D1, the formula will be D1 divided by P naught. Whole thing added by the growth rate. That's it. And is there any relationship between cost of retained earnings and cost of equity? Perfect. Sir, for cost of equity, there will be a flotation cost. But retained earnings will not have a flotation cost. You know, there was one formula. If you know cost of equity, you can find retained earnings. Anybody remembers what is that? How do you get KR? KR is equal to cost of equity into 1 minus flotation cost into 1 minus TP. TP as in personal tax rate. Okay, I've written it here any which way. Okay, so this also sometimes can be used. So because anyway, cost of retained earnings will not have flotation cost, no? So reduce that flotation cost. So from cost of equity, if you do 1 minus flotation cost, you will get it. TP is your personal tax rate. Personal tax rate of the company or the investor. It will be given to you in the question. Personal tax rate is 20%, blah, blah, blah. Take that. Using that, you can find out what? Cost of retained earnings. Another way to find out retained earnings. So far, any doubt, people? All okay? And now, next is KO. KO means overall cost of capital, or they will also say cutoff rate, hurdle rate. It is denoted by what symbol? KO. Overall cost of capital denoted by the symbol KO. Now, what is this overall cost of capital? Now, if you look at it, let's say, sir, company wants to do a particular project and project needs how much money? 100 crore, I've assumed. Now, company feels of this 100 crore, 30 lakh, we will take it from the debt. And that means balance 70 lakh, the company is saying we'll go for equity. Like, yes, no, is it mandatory? Entire 100 crore should come through debt, entire 100 through equity, or any combination is okay? Any combination is company ka choice. Here, company is saying 30% of the money we will go from debt, 70% of the money through equity. Okay, na, Sarji? Now, let's say KD, cost of debt is 10%. Cost of debt, I've assumed it to be 10%. What is cost of equity? 15%. Now, you tell me, should this project be rejected or accepted? Let's say project ka return is 14%. Project ka return is, sir, if you're doing a particular project, company will expect a return. How much return company will get by doing this project? 14%. But in order to do the project, company needs money. And from what source company is raising money? One source or two source? Two source. What are those? Debt to equity. What is debt ka cost? 10. What is equity ka cost? 15%. Now, should the company accept this project or reject this project? Easy decision or difficult? Straight away, can you compare and decide? Because here we are taking one source of finance or multiple source. Hence, to take this decision, we compute another one called what? KO, overall cost of capital. KO is nothing but your average cost of capital. It's nothing but your average. But it is not simple average. It is not simple average. Sir, how do you find simple average? 10 plus 15 divided by 2. 10 plus 15 divided by 2, if you do, I think you will get 22 or 12.5. 12.5 you will get. It is not simple average. Why it is not simple average? Name itself is saying it is weighted average cost of capital. Why can't we use simple average? Because company is borrowing the money 50% from equity, debt, or different amount. 30% money came through debt. 100 ka 30% is 30 crore, na? And 100 crore ka 70% is 70 crore. So company is borrowing the money equally or in different proportion. Different proportion. Hence, we don't use simple average, we use weighted average. Done, sir? So hence, WACC is the component. Now walk me through. For WACC, we had a table. We used to solve all the problems through table. What is that? Source of finance. Then market value, book value. Then weights. Then after tax cost of capital, and then finally KO. Okay. Now people, let us say in this problem only, how much money you needed? How much money came through debt? 30 crore. How much through equity? 70 crore. 30 crore and 70 crore. So totally how much money? 100 crore. Yes, Naji. Now tell me, what is this basically weights trying to calculate? Totally how much money are you raising? 100 crore. In 100 crore, how much money came through debt? 30 crore. Out of 100 crore, 30 crore has come through debt means what is the percentage of money of borrowed from debt? 30 divided by 100 into 100, how much is that? If you want it in percentage, we'll multiply by 100. If you want it in decimal, we'll simply do 30 divided by 100. How much is that? 0.3. Similarly, what is equity ka weightage? 70 crore divided by 100 crore, which is 0.7. Okay, ji. Now take that instrument ka cost. What is the cost of debt, I've assumed? 10. What is cost of equity, I've assumed? 15. So that is your after tax cost of capital. Done now. How do you get KO? How do you get KO? Take that instrument ka cost multiplied by that instrument ka weight. Like it's simply telling 10% will be the total cost, provided 100% of the money has come through debt. And here 100% of the money has come through debt or only 30%? 30%. Hence, you take that instrument ka cost and multiply that instrument ka weight. So you will get this number. Similarly, 15% will be the cost if 100% money has come through equity. 100% has come or only 70%. So hence multiply these two, you will get it. So finally adding these two, you will get overall cost of capital 13.5. Yes, sir. Now you tell me this project should be rejected or accepted. This project is giving how much return? 14%. But what is your overall cost to do this project? Cost is 13.5. Return is 14. That means benefit is more than cost. So project should be rejected or accepted. So to take the decision, KO will be very helpful. That's the reason we compute. And this is how we compute. Any problem? Now what is this market value, book value wala drama? Book value means the value of debt and equity as per our accounts. As per our balance sheet, whatever value is there, that we call it as what? Book value. Sir, in accounts we follow historical cost model. In accounts we follow historical cost model. Like land, I purchased for 10 lakh. I purchased the land for 10 lakh. Land do we depreciate? No, that means land will be shown in our balance sheet at 10 lakh. I purchased this land 5 years ago. When did I buy? 5 years ago. But now also my land value in my balance sheet is 10 lakh only. But is its market value now also 10 lakh or different? Different. So market value, book value will be same or it will be different? It will be different. So hence the weights can be calculated either using market value or book value. What's the first priority? First priority is always market value. Because market value is latest data. No? Book value is old data because you might have issued this instrument 5 years back, 10 years back. Book value is old data. Market value is most recent data. Right? So always we give priority to the most recent data. What is the recent data? Market value. So hence, in fact, many question will specify. You'll have to calculate KO using book value or market value. Question will mention. Right? If they don't mention, first priority will take for market value. If market value is missing, then we will go for what? Book value. That's how we do the selection. Done, Asarji. Now, last concept before we dive into the question. Can we go through that? What is that last concept? MCC. MCC ka full form is marginal cost of capital. Okay. Marginal cost of capital means what? Cost of, same only. Marginal cost of capital is also KO. KO only it is. But it is not the KO for total fund. It is the KO for additional. Only for additional finance, if you calculate KO, that we call it as MCC. Just to give you an example over here, check this. Let's say people, company has 10 lakh equity, 5 lakh debt. What is the total capital? 15 lakh. This is already existing. For this existing instrument, if you find KO, we call it as what? WACC. What is WACC ka full form again? Weighted average cost of capital. This is for the existing. CE means what, people? Capital employed. For existing capital employed, if you find KO, we call it as WACC. Now, company raised new funds. They want to do a new project. For that, they need new fund. So, how much new funds they need? 30 lakh. Of this 30 lakh, how much came through equity? 20. How much came through debt, I assume? 10 lakh. Only for this, only for the new funds, if you calculate KO, only for this new funds, if you calculate KO, we call it as a new term called what? MCC. Only for this, if you calculate KO, we call it as marginal cost of capital. Any problem? Now, sir, tell me what is the total, revised total capital employed now? How much equity we had? 10 lakh. How much extra we raised? 20. Now, how much we have? 30. Similarly, how much debt we had? 5. Now, how much we raised? 10. So, totally how much? 15 lakh. Correct? So, total capital employed 15 plus 30, how much? For this, if you find KO, for this again, if you find KO, we call it as MCC or still WACC? WACC. Because this is only new or new plus old. Whenever you're finding KO for old or old plus new, it is KO. Only for the new instrument, if you find KO, we refer it to as MCC. That's all. That means MCC ka calculation pattern any different or same only? Same only. So calculation mein there is no difference. Just the terminology, Namadaya, Namakarana is different. New Namadaya, that's all. Done, people. This is problem specific pointer. I'll take you through that same question once again. So I think one more is there. I'll run you through that. Now, one more. Now, people, check. There's a question specific adjustment again. I think we can understand this. First, maybe this. Sir, how do you calculate debenture interest? Walk me through. Forget what I've written here. Tell me, how do you calculate debenture interest? You take debenture ka value multiplied by the interest rate. Yes, no? Now, if I give you interest amount, if I give you interest rate, can't we find out debenture ka value? How do you find debenture ka value here? Interest amount divided by interest. Yes, Aji. Sometimes in some problem, debenture ka value will not be given. So we can find that using interest amount divided by interest rate. Now check this. We have done this in the question. I think this example should be good enough. We can cut that question. Let us say, sir, do you think we are the only company who will issue debentures or our competitor also will issue? Our competitor can also issue debentures. Our competitors on their debenture, how much interest they are giving? 12%, I'm assuming. Competitor company on their debentures, on an average, they're issuing how much interest? 12%. But I am issuing the debenture at what rate? 9%. Our company or my company is issuing debentures with what interest rate? 9%. Sometimes we can call it as interest rate or we can also call it as coupon rate, one and the same. Now you tell me, as an investor, you will prefer my company ka debenture or my competitor ka? Competitor, because they are giving higher interest. So everybody will invest there. Will anybody give me or invest in my company or they will not? They will not, because I am giving market interest rate or lesser. Correct, Aji? But I also want people to invest in my company. How do I do this? Tell me what I have to do. Let's say the face value of the debenture is 100. Face value of the debenture is 100. Now you tell me, will I issue the debenture at face value or lesser? Lesser. Because debenture holders, investor are expecting how much return? 12%. But I am giving only how much return? 9%. Now if I issue the debenture at face value, nobody will buy the debentures. So if this scenario, if this adjustment comes in the problem, what is the trick or what is the hidden adjustment? I cannot issue the debenture at face value. I'll have to issue it at discount. Tell me, how much is the debenture value? How much is the debenture value? How do you find out debenture value? Just now we discussed. Interest amount divided by interest rate. Interest is always calculated on the face value. What is the face value? 100. Am I giving the actual interest rate at 12% or 9%? So what is the actual interest amount I am giving to the debenture holder? 100 ka 9%. How much is that? 9 rupees. Yes, sir. Divided by interest rate. Interest rate we have to take or expected interest rate? Expected. How much are they expecting? How much are the debenture holder expecting? 12%. Divided by 12% you do. The expected interest rate. How much are you getting? 9 divided by 0.12 if you do, you will get 75. That means face value of the debenture may be 100, but I cannot issue it at 100. I have to issue it at 75. So 75 becomes your issue price. If you want, I can do the math also. How much is the investor giving me money? How much money investor gave? 75%. Maybe here. Investor is giving me the money of 75%. on how much ever investor invest, how much return investor will expect? 12%, correct? No. So 75 ka 12% you do. How much is that? 9 rupee. And how much am I paying to them? 9 rupee. Matched out. Yes or no? So that way investor also happy, I am also happy. Because they got their 12% return and I got the investors to invest in my company. This is the drama. Okay now people, when will you apply this? Tell me once again, which scenario will you apply this? When they give you two interest rate. What interest rate? One is the actual interest rate, another one is the market interest rate. If my actual interest rate is lesser than market interest rate, then the only way I can convince the debenture holders to invest in my company is to issue the debentures at discount. And what is the simple formula to get this? Actual interest amount. Numerator may you will take actual interest amount divided by actual interest rate or expected interest rate. Expected interest rate. That's your formula. That will give you the issue price. So in these sort of problem, issue price will not be given. We need to find out. This is simple. No? We'll take care of this. No? We have done 2 questions on this in regular class. But now again, we'll not have time to go through all the problems. So small adjustment I'm discussing with the help of this example only. Need a minute or okay? Yes, sir. What is the 75? Again, walk me through. Issue price. Is this net proceeds? Is this net proceeds? No. How do you get net proceeds? Issue price minus flotation cost. So do not forget flotation cost. Suppose flotation cost is 5 rupees. Issue price how much? 75. If flotation cost is 5 rupees, then the net proceeds will be 70. Take this number and then apply, use approximation method or IRR method or whatever the question says. This is one small specific question specific adjustment. One more shortcut method was there. What was the shortcut method? Sir, if what is the approximation method ka redeemable debt ka formula, you tell me? Cost of debt ka. Interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Correct, Aji? That's a normal way. You can find the cost of debt using that formula, or you can go for one more shortcut. You will go for shortcut when RV and NP are same. When the RV and NP are same. If you want, just tell. All of you solve this for me. Let's say the face value of the debenture is 100. Face value how much? 100. What is the actual interest rate company is paying? 10%. So what is the interest amount? 10 rupees. Tax rate, let's say, is 30%. RV, NP, both I've assumed it to be how much? 100. And N is 5. Plug this number and work out cost of debt for me. I here is interest in this formula. I is interest rate or interest amount. In this formula, I stands for interest amount. How much is the interest amount? 10. So if you want maybe interest of time, I'll only check here. 10 rupees into 1 minus tax rate. Tax rate is how much? 30%. 30% in full number will become 0.3. Plus RV. How much is RV? 100. Minus NP. How much is NP? 100. Divided by N. N is how much? 5. Whole thing divided by what? RV plus NP divided by 2. When you do it, what are you getting? 0.7 or 7%. Everybody okay now? This is the number your calculator is showing. Now you don't have to do all this drama in this case. When RV, NP both are same, you can get cost of debt simply by taking I into 1 minus tax rate. Interest into 1 minus tax rate. I here no is not interest amount. When you're using the shortcut method, I is not interest amount. I is the interest rate. What is the interest rate? 10%. Take your calculator. 10% into 1 minus tax rate you do. Tax rate is 0.3. 10% into 1 minus tax rate, you do how much are you getting? 10 into 1 minus 0.3. What are you getting? 7%? Yes, no. That means whether you use approximation method or whether you use shortcut method, answer is same. Tell me which is faster? Shortcut. When will you go for shortcut again? Once again, tell me. Every formula mein shortcut will work. No. Shortcut will work only when RV NP is same. Or if they have not given RV NP ka data. If RV NP ka data is not given, means RV NP will be assumed to be same. So in those cases, instead of applying this formula, you can use one more shortcut formula. What is that one more shortcut formula, people? I into 1 minus tax rate. I here is not interest amount. I in the shortcut method is interest rate. That's all. This also we have applied. Especially when they give you bank loan and all. Bank loan. On bank loan and all, will you redeem more? If you take principal loan of 10 lakh, how much principal you will repay? 10 lakh only. That means for a bank loan and all, RV, NP, everything will be same. So you don't have to use this formula. You can directly go for shortcut formula. Done, Aji? So this was your overall concept of cost of capital. Can we have one quick 2 minutes ka full recap and then take up some questions? Chapter name, or 1 second, I think everything done. Yeah, all problems done. Chapter name, cost of capital. Capital here refers to share capital. No, capital here refers to, you want me to show the screen? Okay, 1 minute. Okay, I'll show you also. Capital here refers to long-term source of finance. Every long-term source of finance will have a cost, and that cost only we are trying to find here. Done? That is one. Now, first instrument ka cost, that is cost of debt. Debt here refers to debenture as well as bank loan. Now, first, in order to find out cost of debt, we need to check whether it is irredeemable or redeemable. If it is irredeemable, cost of debt denoted by the symbol KD is given by the formula interest amount into 1 minus tax rate divided by net proceeds. Net proceeds, first priority for net proceeds will be what? That depends on whether it is existing or new. If it's a new debt, first priority for issue price, IP missing, market value also missing, face value. If it's an existing debt, first priority, market price, market value, MV missing, face value. Doesn't matter what you take, flotation cost you need to minus. Then only you will get net proceeds. If it is a redeemable debt, then cost of debt is given by the formula interest amount into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. In this formula, I stands for what? Interest amount. T for tax rate. RV for redemption value. NP for net proceeds. N for N is not total life. N is your remaining life in this problem. Somewhere I must have written somewhere. Okay. N is for remaining life. Keep that in mind. Okay. Suppose 10 years is the term of the debenture. 10 years is the term. 3 years is already over. 3 years is already over. N is 10 na, or N is 10 minus 3, 7 na. N is always remaining life, not total life. Keep that in mind. Okay. These two formulas we call it as what, people? Approximation method. There is another way to find cost of debt, that is your IRR method. In IRR method, we use interpolation formula. What is interpolation formula? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower rate. Keep in mind, at higher rate, usually NPV will be negative and you are already minusing it. Negative of negative will become positive. That you want, again, keep in mind. And any rate you can assume, yeah, your choice. But ideally, ICI assumes one rate where you get NPV negative and one rate where you get NPV positive. That's how ICI solves. If you want, you can follow the same, or using your choice, you can do it. Now, this is about your IRR. And walk me through IRR ka table format. Year, cash flow, discount factor, present value of cash flows, second discount factor, second present value. Year may you will start with year 0. Then suppose it's a 5-year debenture. Will interest for all the year differ or same? That means you can write in year column 1 to 5 and again 5. What is this 1 to 5 for? 1 to 5 is for interest. You will take interest or after tax interest. After tax interest. In 5th year, you will take redemption value. At year 0, you will take net proceeds. Net proceeds will be negative because you are putting this positive negative sign. Though company is calculating IRR, IRR is a return. Why we put the sign from investor perspective is IRR ka full form is internal rate of return. For a company, it's a return, or an investor. Hence, positive negative sign, we put it from whose perspective? Investor perspective. So first year 0 may you'll take net proceeds as a negative number. Then you'll take interest or after tax interest. After tax interest. Last year may you'll take redemption value. Plug and do it. Okay, next they went for convertible debentures. In convertible debentures, first you'll ask one question. What is that? Whether it is compulsorily convertible or optionally convertible. If it's compulsorily convertible debentures, then you'll only take the redemption value of the share option. If it is optionally convertible debentures, then you will take redemption value of cash option, redemption value of share option, whichever is higher. Rest everything is same, no change there. Plug this number into approximate formula or IRR formula and continue. Next we went for preference shares. How do you find preference shares ka formula? Same. First ask whether it is redeemable or irredeemable. If it is irredeemable, on preference dividend, you'll get tax benefit or no tax benefit. Substitute interest with preference dividend. Wherever 1 minus tax rate is there, keep it or cut it off. So irredeemable debenture, irredeemable preference shares का formula is preference dividend divided by net proceeds. Redeemable means preference dividend plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. These two becomes your approximate formula. Or you can also use IRR. If you are using IRR, at year 0 you will take net proceeds, negative. Then suppose the term of the preference shares is 10 years. Then in the column you will write 1 to 10. You will take after tax preference dividend or preference dividend only. Only preference dividend you will take. 10th year you will take redemption value and use the interpolation formula. Next is cost of equity shares. Dividend price approach ka cost of equity is given by dividend divided by price. This method assumes dividend to be constant. Then earnings price approach. In earnings price approach mein formula is EPS divided by MPS. This method assumes EPS is constant. Then Gordon Chacha. Gordon Chacha ka formula is D naught into 1 plus growth rate divided by P naught minus flotation cost. Whole thing added by growth rate. Or if they have given D1, formula will be D1 divided by P naught minus flotation cost. Whole thing added by growth rate. D naught is dividend already declared or dividend already paid. D1 means expected dividend. G for growth rate. One way to find out growth rate is trial and error. Or another way, B multiplied by R. B is your retention ratio. R for your rate of return on your investment. Okay. Next, CAPM model. In cost of equity as per CAPM model will be RF. RF as in risk-free rate of return plus beta into RM minus RF. RM is your market return. RM minus RF is what we refer to as risk premium. If it is directly given, take that. Then realized yield approach. Realized yield approach is nothing but IRR. But blindly don't go for IRR. Ask one question. What is that question? Year-wise return, can we find out or we cannot find out? If year-wise return you can find out, then find out each year ka. Usually you'll be able to find 4 years ka return. First year ka return denoted by what symbol? 1 plus Y1 given by the formula D1 plus P1 by P0. Second year ka return denoted by the symbol 1 plus Y2 given by the formula D2 plus P2 divided by P1. Third year ka denoted by symbol 1 plus Y3 given by D3 plus P3 by P2. Fourth year ka denoted by symbol 1 plus Y4 given by D4 plus P4 by P3. Multiply all the 4 year ka return and find out which root. Fourth root. Why fourth root? You are able to find out the return 4 years. And minus 1 you do. You will get the cost of equity. If year wise return, if you cannot find, then you will go for normal IRR method here. Okay. Then cost of retained earnings. Cost of retained earnings and cost of equity are same, except you will not use flotation cost. Rest all the formulas same. And one more way, from cost of equity, can we find cost of retained earnings? Yeah, one formula is there. KR is equal to cost of equity into 1 minus flotation cost into 1 minus TP. TP as in personal tax rate. Last thing is overall cost of capital denoted by the symbol KO, also known as weighted average cost of capital. For the weighted average cost of capital is simple average or weighted average. And how do you find out this weighted average? First source of finance, take basically that instrument ka weight multiplied by that instrument ka cost. Yes, sir. In fact, if you are for your cost of overall cost of capital, you can construct one shortcut formula also, which you have used in system is doing weird. Where it went? One more formula you can write. Anybody remembers? We have used another way. Overall cost of capital is given by the take cost of debt multiplied by weight of debt. Plus, if you have equity, then take cost of equity multiplied by the weight of equity. Either you can solve using table method or you can do it one-liner using this formula also. We have used this in chapter number 5, capital structure problems, if you remember. Both are acceptable. Whichever way you're comfortable, you can use it. Basically, take that instrument ka cost, multiply by that instrument ka weight. Take that instrument ka same. I've just written 2. You should have only 2 or you can have multiple source. If you have retained earnings, if you have preference shares also, what you will do? If you have preference shares in this formula, then you will take cost of preference shares multiplied by weight of preference share. How many ever source of finance is there? Add it up and do it in this plugin, this particular formula. And what is the first priority to find out weights? Book value or market value? Market. If the question is silent, always pick market value. If the question says use book value, then only use book value. Okay. All right. Then last is your MCC. MCC is, it is same KO only, but for additional funds raised. Only for additional source of finance, if you find KO, we call it as marginal cost of capital. Nice ringtone. All right. Then people, can you find out debenture value? Yeah, you can find debenture value using a particular formula, shortcut way. What is that? In actual interest amount divided by actual interest rate or expected interest rate. Expected interest rate. Keep this in mind. This becomes especially important when market interest rate and actual interest rate will match or mismatch. See, I am paying 9, but market is paying 12. So in these cases, debentures will not be issued at face value. It will be issued at discount. That will be the hidden adjustment on this. And one more shortcut way to find out cost of debt. How is that? If RVNP, if it is same, if RVNP and all is same, either you can use a normal approximation formula or you can go for shortcut. What is shortcut formula? Interest rate into 1 minus tax rate. This is for cost of debt. Similarly, what is a shortcut way for preference shares? On preference shares, will you get tax benefit? That means cut off tax benefit. What remains? Interest dividend rate. The dividend rate only will become KP when you're using shortcut method. And when will you go for shortcut method for KP? RV, NPR, same. Done. This was your conceptual revision. Now can we go for, I think we do have some time. Can we go for a few questions? Okay. Let's take up question number 21. I'll take up those questions, people, and those of you, if you have already watched previous marathon, right? This one again you don't have to watch. Okay, more or less it will be same. Some questions I'll keep replacing it. That's all. But conceptual explanation will be pretty much same. So no need to watch both and all. So that much Kripa Kataksha you don't have to show it on me. One is good enough. Don't waste your time by watching unnecessary things. So, now people, this question also off late. This question is repeated multiple times. So we'll go for question number 21. My voice is audible, na, in the back there. We are used to speaking on mic. Now we are not using mic, but still balcony okay, no? That side, this side. All good. Done, people. I would love to know your name, but I'm a little time pressed. So somewhere during the break, we'll catch up and try to get to know you. Okay? All right. Now calculate WACC, KO by using what? Book value and market value weights. Both we need to find. So that way, good revision question, we can summarize both. Debenture, rupees 100 per debenture. 100 per debenture andre face value. What is the total face value? 5 lakh. What is the face value of one debenture? 100. Similarly, each preference shares ka face value? 100. Total face value? 5 lakh. Each equity share ka face value 10 and total face value is 10 lakh. That means we have one source of finance here or three? 3. Put together totally how much? 20 lakh. Just keep your calculator. No need to write down anything. These are our study material questions. You will find this in many RTPs and MTPs also. Market price of the share is also given. Obviously, they asked us to find out using book value and market value. Now, 1 second, people. They said capital structure of the company is as follows. Capital structure means this capital company is planning to raise or already raised. This capital or this source of finance company has already issued. I mean, this is a value as per what? This is a value as per accounts. That only we call it as what? Book value. So this value is nothing but your book value. So using this, you will be able to answer the first requirement. But they also need to find out what? Market value. For that, they have given it over here. Once again, everyone tell me over here. How much is the total face value of the debenture? 5 lakh. Each ka face value how much? 100. That means how many debentures we have, people here? 5 lakh divided by 100 if you do, you will get how much? 5,000. Yes, no? 5,000 is the number of debentures. Do you agree with me? Or maybe can I write it like this? Number. How many number of debentures we have? 5 lakh divided by 100. How much is that, people? 5,000. Similarly, 5 lakh divided by 100. How much is that? 5,000. 10 lakh divided by 10. 1 lakh. So these are the instruments we have. Do you know market value of each debentures, preference shares and equity share? Yeah. You take market value of each and multiply by the number of instrument. What are you going to get? Total market value. That way you will find out market value also, which will help you to sort out the second requirement. Done. Now additional information is given. 100 per debenture, the face value are redeemable at par. Redeemable at par means RVI got how much? 100. Par value means face value, which is 100. Then they said what? 10% coupon rate. Coupon rate means interest rate. On this debenture, we are paying 10% interest rate. Flotation cost is 4%. Don't forget that. 10-year maturity. So 10 becomes your N. Sir, the moment they give you RV, it is irredeemable debentures or redeemable? In fact, they've given maturity period also, N also they've given. So this is a redeemable debentures. So which formula you will use? Redeemable. Don't blindly start. Here ICA will put a bomb. At the end, they will say, see, use YTM method for cost of debt. We have seen many students like this. They'll see the data, they'll be like, nice, start solving. Right? They'll always know, people, when the question is big. In fact, it's a good practice, always quickly know the requirement. You don't have to spend too much time, just quickly read. They're asking use YTM. YTM method means yield to maturity, or IRR method for what? KD and KP. But for equity shares, they have not told. We'll see that. So can we use that formula or IRR? IRR is your favorite. Yeah. All right. Now, people, if you want, there's an option, not compulsorily required in exam. Now, some students will have the buku, the fear of what rate to assume, sir. In class, we assume the rate, so it is easy for you. Aram se you will copy. But in exam, when they directly ask IRR, our mind will be like 5, 7th, okay, 10, what rate do I assume? Can become a little bit of problem. So if you are in that category, I'm not saying everybody will be in that, but if you come to that category, you don't have to tell anybody, right now. So if you are in that category, what you can do for yourself is first solve using approximation method. No need to quick solve, just do it in your calculator. Now do it in calculator for me, just let's see. Or here only quickly I will solve. What is that number? Tell me. What is the formula, people? Tell me here. Interest into 1 minus tax rate plus RV minus, it's coming out. 1 second. I'll have to pull this in. Interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. How much is interest amount here? Interest is calculated on what? Face value. What is the face value of the debenture? 100. What is the actual interest rate? 10%. How much is the interest amount? 10. So interest amount is 10 rupee. 10 into 1 minus tax rate. What is the tax rate, people? Somewhere we saw tax rate, no? Where is tax rate? Here, tax rate is 30%. So 10 is your interest. 10 into 1 minus tax rate if you do. So 7, so you got 7. Plus RV. How much is RV? 100. Minus NP. Minus NP. NP, be a little careful. New debentures. New debentures. Okay. Sometimes, what, people, you'll not be able to figure out whether it is new debenture or existing. In that case, if that's category, first check if issue price is given. If issue price is given, issue price given, issue price, they told redemption price. Have they given issue price? No. If IP is missing, next priority for market. Okay, how much is market value? 10. Can market value become net proceeds, or you have to reduce flotation cost? Reduce flotation cost. So 105 minus 4% you do. How much is that? 105 minus 4%. How much is that? 100.8. Got it. Or maybe I've solved it here. I'll quickly show. Where is it? Here. You're getting the same number. NP is 100.8. Correct? RV is how much? 100. Divided by N. What was N here? 10. 10 years is a life. Whole thing divided by RV plus NP divided by 2. So when you solve, we are getting 6.89 roughly. Correct? Sir, whether you go for approximation method, this, or IRR method, answer will not be same, but answer will be close. Answer will be close. That means in formula method, what are you getting answer? 6. 6.89 something you're getting, subject to decimal. So what I will do is take one number below this, take one number higher than this. 6 minus 5 is how much? 5 plus 1%. So what is it? 7. That means what rate I'm going to assume? 5 and 7. That way you can do. Is this compulsory or your choice? Your choice. You can directly start with 8 or 10 or 12, whatever. If you don't get that hard to proceed, then first solve like this. Should you have to write each step or calculator? Quickly calculator. That way you will get the answer. And now you can figure out one rate below this is 5. One rate above is 7. Take 5 and 7 and solve the question. That is another way. Done now? Okay, walk me through IRR ka process, cost of debt. You'll start with column you already know. Year, cash flow, discount factor, present value of cash flow. First discount factor I'm assuming 5. Second discount factor 7. Year column you will start with year 0. Year 0 always net proceeds. Always net proceeds. How do you get net proceeds? Here IP is missing. So you took market value. Market value or market value minus flotation cost. Market value was 105. When you reduce flotation cost, you got 100.8. So year 0 may you will start 100.8. Positive, negative, negative. What's the term of this debentures? 10 years. Every year interest changing or same. So should you solve it 10 times or shortcut? Shortcut means PVIF or PVAF. In the year column, what you will write? 1 to 10. Cash flow column, you will take interest or after tax interest? After tax interest. How do you take after tax interest? Interest amount, which is 10 rupee, into 1 minus tax rate. How 10 rupees? Interest is calculated on face value. Face value is 100. Interest rate you're paying is 10%. 100 ka 10% is 10 rupee. Into 1 minus tax rate, if you do, you'll get after tax interest. Comfortable? 10th year, you have to take one more. What is the one more you have to take? RV. RV as in redemption value. They told in this problem it's redeemed at par. So par value is how much? 100. Yes, Aji. Solve and at 5% when you solve, you are getting 14.63. But we want what? If 14%, if 5% is the right answer, my NPV should have become 0. So is 5% my IRR or cost of debt, or take one more rate? Take one more rate at 7%. At 7% we are getting negative. So IRR is somewhere between 5 to 7. Plug in the interpolation formula. Should I have to take you through this again or okay? This is comfortable now. So you got finally what answer? 6.8. That is one way. Done now. No issues. And now same way for preference shares. Even preference shares we'll have to solve under IRR method. If you want first, what you can do? First solve under approximation method. Compulsory or your choice. Why are we doing this for? To find out the discount factor. It's completely your choice. When you solve same thing, now KP first under approximation method. What is approximation method ka formula? Preference dividend. First of all, preference shares, was it irredeemable or redeemable? I think we didn't read that data, no? So here check. And maybe one more point. A student will ask, sir, they have given 4%. This flotation cost is a number or percentage? This percentage, should we apply it on face value, which is 100, or issue price? This 4% flotation cost, should we apply it on face value or issue price? Depends on the question. Sometimes the question will say apply flotation cost on face value. In that case, you will apply it on face value. If they have not told anything, always calculate flotation cost on the issue price itself. Issue price or market value, whichever you are taking. Okay, that only you calculate. Done, Naji. But usually question will mention that. Okay. Next to preference shares ka data. 100 rupees is the preference shares ka face value. They are redeemable again at par. That means redemption value is 100. You got that. Coupon rate. Coupon rate here for preference shares, it is interest rate or dividend rate? Dividend rate. 2% flotation cost. 10-year maturity. Sir, have they told to calculate flotation cost on face value? No. So you will apply what? Market price or issue price, depending on what you are taking. Now you tell me, for this preference shares, issue price given a missing. Missing. Have they told this preference shares are issued at 110 blah blah? No. If IP is missing, you will give next priority for what? Market value. What is the market value? 110. So you will calculate flotation cost of 2% on 110. Done now. And now check, I've just solved it for you here. Preference dividend. Preference dividend, interest and equity dividend. Everything calculated on face value. 100 rupees is a face value. Dividend rate is 5%. So preference dividend becomes 5. Plus RV. RV you already know. How much is that? It is redeemed at par. Par value is 100. Minus NP. How do you get NP, people? How do you get NP here? Walk me through. Issue price minus flotation cost. Right? But IP is there? No. So what we took? Market value. So here NP will be market value minus flotation cost. What was the market value given to you in the problem? 110. Minus flotation cost. Flotation cost we will calculate on market value itself. So when you calculate, you will get 107.8. N is your remaining life. Have they told anything specifically about remaining life? No. Hence we will take the data given. How much is the data for N they have given? 10 years. So plug this into the formula, you will get 4.06. Now you tell me, for IRR method, what rate will you assume? One rate below, which is what? 3. One rate above, which is what? 5. So that means for IRR method to find KP, we'll take 3% and 5%. Done now? Just walk me through the year columns. You'll start with year 0. Year 0, what you will take? Net proceeds. Then, what is the term of this preference shares? 10 years. You'll take 1, 2, 3, 4, 5, 6, 7, 8 or 1 to 10. Here you will take after tax preference dividend or only preference dividend? Only preference dividend. 10th year you will have to take the redemption value. Okay, Naji. Remember, net proceeds in negative, redemption value and preference dividend in positive. Because you're putting the positive negative sign from investor's viewpoint. Solve and you'll get the answer. Easy na, sir? This is also pretty comfortable. This is about your KP. This is okay, no, we don't have to go through each step, right? Just a walkthrough should be fine for us. Revision, right? All right. Now, equity shares. So, flotation cost given in percentage or directly the value? Flotation cost itself is 4 rupees given. Market price is how much? 24. Next year expected dividend. Dividend paid ala. Expected dividend means D0 or D1? D1. Growth rate they have given. Now, there is only one formula in equity shares which uses growth rate. That is our Gordon Chacha. So, that means we have to find cost of equity using Gordon Chacha ka formula. Done now. We'll use D0 ka formula or D1 ka formula. D1 ka, because they have given D expected dividend in this formula. And growth rate we have to find or given only. Tell me again once again formula. What is cost of equity as per Gordon Chacha? D1 divided by P0 minus flotation cost. Whole thing added by growth rate. Do it quickly in a calculator. D1 is 1 or maybe why to do it. I'll show it over here. D1 expected dividend. How much is that per people? 1 divided by P0. Sir, P0 you will take what as first priority? Issue, if you are not able to find out whether it is new instrument or existing instrument, first priority you will give still for IP. IP missing means market value. That is also missing means face value. Your IP given for equity shares. So you will use what? Market value. What is market value of equity shares? 24. So that becomes your P0. Minus flotation cost. How much is flotation cost? 4 rupees. Whole thing added by the growth rate. If you do it, 10% is your answer. Done now. Alright. Now people, to calculate KO, we need all the instrument ka respective cost and all the instrument ka respective weights. So now simply plug this into the formula and get it. Using book value if you're finding KO. What is the book value, people? 5 lakh, 5 lakh, 10 lakh. So tell me the weights. Total money raised is 20 lakh. Out of that 20 lakh, from debentures you have got 5 lakh means what is the weightage of debenture? 5 lakh divided by 20 lakh. How much is that? 0.25. Yes, somewhere is it? Here. That is your weightage for this thing. In fact, people, in exam, is this column really required, or you can start from this? Effectively, we need what? Weights. Right? If you want this book value column totally, you can cut off. Or is this table or required, or you can use one line of formula? What is that one line of formula? Weight of debt multiplied by cost of debt plus weight of equity, and that one line of formula also you can use. Or if you're comfortable with the table, do the table. Okay. So weights calculation. Understood, everybody? And this after tax cost of capital will come from our previous working notes. So take that instrument ka cost, multiply that instrument ka weight, you will get KO. Adding all this, you will get overall cost of capital this much. Done now. One more point is, sir, this cost of capital, if you want, you can take it in decimal or you can take it in percentage. If you take this in percentage, 6.89%, that means final answer will be in percentage. If you take decimal, then final answer will be in percentage, and you'll have to convert it, multiply this by 100 and get it into percentage. I recommend you to use percentage so that you will get the answer faster. But in all our problems, all our class, we have taken the decimals because initially stages we were in, so I took all the things in decimal. Now we are in exam stage, so we will probably prefer those methods which will save more time. So which will save a little more time? Percentage. So hence I would recommend you to take directly percentage. So answer will be directly in percentage. Now market value. Just can you help me calculate the market value, people? Just that alone. How do you calculate market value? One quick way to calculate market value is what? Very simple. Total book value of debentures is how much? 5 lakh. What is face value of each debenture? 100. Sir, if you do 5 lakh divided by 100, what are you going to get? 5,000. That is the number of debenture, and each debenture ka market value is given as how much? So multiply, you will get the face value, or you will get the market like this. Yes, Ajay. So how much you getting? 5 lakh 25,000. Okay. Same thing you calculate for preference shares. We'll check. You will take 5 lakh divided by each instrument ka face value 100 multiplied by the market value of each preference shares, which is 110. How much is that? 5 lakh 50,000. Same for equity shares also. 10 lakh divided by face value of each share, which is 10. By doing this, what are we going to get? Number of equity shares multiplied by market value of each equity shares is 24. So if you do 24 lakh, that's all. So how much was that value you said? 5 lakh 25, 550 and 24 lakhs. So total is 34 lakh 75,000. Rest is weights. How do you calculate weights as per market value? Same. Total market value is 34 lakh 35,000. In that 5 lakh 25,000 has come through debenture, means what is the weightage? 5 lakh 25,000 divided by 34 lakh 75,000, which is 0.1510. Done, sir. Sir, another doubt is, sir, how many decimals should I take, sir? ICI, in their majority of solutions have started to take 3 decimals. So if you want to follow, actually there is no pakka rule that you have to take 4, 3, 2, 1, right? If you want to sync up with ICI, they are taking how many decimals? 3 decimals. So if you want, you can also solve for exam in the same fashion. Even if you take 4, in my view, marks will not be deducted for it. Okay, na? Just for ICI syncing up, if you want, you can take 3. Any problem in this problem, people? Easy, no? Just a walkthrough of this question. Hungry, yeah? Not angry, no? Fine, right? All right. I can do a few more questions. Now, 1 or 2 more we can do and then take a break if required. Of course, break is required. But after 1 or 2 questions is okay. Done. Sir, people, this question also we have seen repeating in exam multiple times. By the way, all of you have, I didn't ask, how many of us are meeting for the first time? First, sorry, I'll rephrase that question. I think meeting for the first time, yeah, since I take classes in Bangalore, we would have not met. How many of you have not attended my class in one form or the other and you're seeing me for the first time? So are we okay, comfortable with the approach, methods and all? That's okay, right? That's okay, all right. So why I specified is, in fact, if you want, I think balance, I believe others are all have taken classes from me or some way or the other. Remember, we used to give LDR questions. LDR is last day revision. If you want, for those newcomers, you can share it with them so that it can help them on the examination day as well. If you want, you can collect. I don't have the list with me, otherwise I could have shared it with you. Okay. So these are all coming under the LDR list. Okay. Yeah. And by the way, how many of you are writing both the groups? Remaining all group 2 or group 1 is already over. Already cleared. Now group 2 is pending. How's your prep going? When don't ask this question, sir. Rest everything is okay. You chumma do your work. Don't ask this preparation and all. Our heartbeat will increase a little. Yeah. When is the group 2 starting, by the way? 11th. Oh, yeah. Exam got pushed a little bit, right? But still, group 2 may not much impact, no? 2 days it got pushed. Okay. So, which is your in group 2? I think what costing FM is practical paper. Auditing SM is Daivame paper. Yeah. All right. You're comfortable, overall? What do you think your strong subject is in group 2? Costing, okay. FM is also okay. Mostly costing. Auditing, no. I thought someone will say auditing. Auditing, nobody. No, not even single takers. Why? Karthik sir on that side is laughing. I put in my heart to blood. They're not choosing my subject only. Yeah, but I do understand. Auditing is too much of theory, too much technical. You need to remember, I think. Yeah, but people don't ignore or don't do that favoritism. That costing FM properly I will study, and auditing I will just prepare that much where I get 40. Don't do that, because in practical paper, there is always a scope to, they can manipulate the question just by changing one data or bringing in one new adjustment. They can kind of spoil your whole day, whole mood, whole exam, whole group ka exam. A lot of things can happen, right? Especially with practical paper. With theory paper, you don't see that with too many questions, right? Yes, remembering theory is tough. Studying theory is even more tougher. Okay, the moment we start, we'll be like, yeah, that wala feeling. I do know that. Yes, about 14 years. I mean, yeah, but back I was also sitting on the other side, so I get that feeling, right? So, but still, yeah, she came at the exact same time. She was studying auditing only, so she said for 2 hours. Yes, no, ma? Yeah, settle down. FM marathon only, no. So, but in order for you to crack the group, right, one exemption you should get ideally in some paper. And especially if theory papers cross somewhere 50 range, right, more or less you could say you're past that group. Because majority of the students find it difficult to clear aggregate because of theory paper. Because then auditing on papers like this, they'll end up scoring 43, 44, sometimes 39. Ouch. That, very difficult to recover. Yeah, too disheartening. We've seen so many people, 154 in aggregate, 38, 39 in one subject, and 58, 59 in another subject. So exemption also gone, aggregate also gone. Once again, we have to study. Yeah, that is very difficult to digest. So don't keep your preparation to that touch and go thing. Try to go one subject a little more. Whichever is your favorite subjects, try to do one extra revision for your favorite subjects so that you try to cross 60, 65. In one paper, I feel if you cross 60, 65, more or less aggregate will be cleared. Okay. So focus on this, and theory also at least revise. Just don't go study, because theory you'll not be able to remember unless you revise it often. So don't ignore the theory blatantly. Okay. Prepare, because theory is a paper which will ultimately make you chartered accountant. Trust me on that. Yeah, it is. Though we like practical subject, theory is the one which actually helps you to clear examination. For many of them, because you need to score 40, 45 there to cross the aggregate. Otherwise, CA will not be chartered accountant. It will be come again for exam, which we don't want to, right? Yeah. But yes, do keep the confidence high. Never let in the last 15, whatever, how many days you have roughly now? 20 days. Never let your confidence come down. I feel CA examination at the end of the day is purely confidence. Preparation backed by confidence. Otherwise, it will become more confidence. Not preparing and say, Pathikla macha. That will not work. You need to prepare once, revise once. If you have done this, convince yourself, I'll be able to do it. Just keep yourself this very, very calm. Let this not beat faster than what it is actually required. Let it beat faster for your girlfriend, boyfriend, not for exam. Okay? Keep this quite calm. I do know that last 20 days in the exam can be very, very stressful. Okay? But tell yourself that it is just an exam, not your life. Just one part of your life called exam, and that too, this part will stay with you maybe for another 1 month. Sir, your existence is 70, 80 years. Yes, no, 70. Less, she's saying 150 kodo. Okay, 150 for you, ma. All right. So in 150 years of your existence, 1 or 2 months you are spending for exam. If you say classes, preparation, everything put together, that is hardly 2 years. Whole CA journey. So that is a very insignificant portion. Because of that, you should not become too much anxious, depressed, and all that. Not worth it. Nothing in life is worth getting depressed for. Life is a celebration. We should celebrate. Right now, it's a journey. We are celebrating this with the help of studies. Just aram se, enjoy fully. That's what I would say. If you're studying, be so involved with studies that you should say, wow, what a person. You should give that flying kiss to yourself. Because I'm so happy that I've prepared well. When you're doing like that, right? And once the exam is over, go to the road and dance, I say. Yeah. Right? And then we celebrate like our Talaiva movie, no? Talaiva Talapati movie. Like that, you should celebrate your result. Put out a cutout for yourself, pour milk. That's. I mean, if you do that, let me know. I'll also come. I'll also pour a little milk for you. Yeah. So I'm just saying, give yourself 100% in any direction. Whatever you're doing, give yourself 100% involved so that later you don't have that regret. Because after exam, I see so many students telling, I should have studied 15 days more. Just 1 month more. So let us not have that regret life. Life, I feel, should not be lived on a regret terms. Full in. Live life in such a way that chairman should be proud. I say chairman, wow, Macha, what an amazing person you are. Take that. You'll be like, yeah, thanks, Macha, and move on. Right? That way. Yes, can we come back to the, can we come back to the question? Question number 22. This question is also repeated a few times in exam. Let's see what we can learn from this question. This question is on MCC. MCC as in marginal cost of capital. ABC has the following capital structure, which is considered optimum. Optimum means ideal. Optimum means ideal, perfect, you could say, like you wonderful people, this capital is perfect. That means you tell me, if it's a perfect capital structure, then the weights are also perfect. Weights are also perfect. Would you like to change that perfect weights or not change? Not change. First, find out the weight. What is the, we have one source or three source? What are the three source? Debenture, preference shares, equity shares. Debenture, how much money? 30. Preference shares, 10. Equity, 160. Total, 2 lakh. First, tell me what is the weightage. Out of 2 lakh, 30 has come through debentures. What is the weightage? 30,000 divided by 2 lakh. How much people? 0.50, no? 0.15. Similarly, calculate. Out of 2 lakh, 10,000 has come through preference shares. So, weightage is 0.10. So, balance will be from equity. 1,60,000 divided by 2 lakh. How much, Saru? This second one is 0.05. Huh? Okay, second one is 0.05. And equity is 0.8. So, total of weight should always be 1. Okay, na? If you are getting any, sometimes when you get in decimals, right, they'll adjust the decimal in the last. Total of weight should always be 1. Right? If you are taking, let's say, 4 or 5 decimals over here, then try to adjust the decimal round off error in the last one. Anywhere you can adjust, but in class we used to do it in the last one. Okay, na sir? Now this weightage they are saying is optimal. That means will this be changed or maintained? Maintained. Keep that point in mind. Company share has a market price how much? 23 point share. So when they say share, it is always equity share. If they don't mention whether it is preference shares or equity shares, it is always equity shares. Because usually preference shares are not traded in the stock exchange. Which shares are traded? Equity shares. So here it's a equity shares ka market price. Next year dividend. Next year dividend means D0 or D1. Dividend already declared or dividend already paid, we call it as D0. This is dividend paid or next year dividend. Next year dividend. So D1. Given or directly or some percentage. It is 50% of 2017 ka EPS. Now check the next slide. They've given. This is the EPS data they've given. From 2008 till 2017. Many years ka EPS they've given. How much is EPS for 2017 that they said? 2.36. So what will be D1? What will be D1? D1 will be 2 point, how much is that? 2.36 ka 50%. How much is it, Guru? 1.18 is your D1. Any problem? No. Okay, next. The following trend in EPS they've given for 10 years. Sir, why did they give you EPS ka trend? Basically, they've given 10 years ka EPS. Why? Growth rate. Now check. 2018 May it was 1. 2008 May it was 1. Next year it has become 1.1. I mean, there is no growth rate or there is growth rate? There is. Sir, if there is no growth rate means, if 2000 EPS was 1 means next year also it should have been 1. Then also it should be 1. Is it same or increasing? Increasing. So there is a growth rate. If you want formula for, you can directly do it. I think it's 10%. 1 plus 10, you can do it in trial and error method. 1 plus 5% you do. 1, take 1 and do 5%. How much you get? 1.05. Is it 1.05 or 1.1? So 5% is not growth rate. Test it at 7%. 1 plus 7%. You're getting 1.07. Matching. No, it should match with 1.10. Now you take 1 plus 10%. 1.10. How much you're getting? 1.1. Now again take 1.1 plus 10% if you want. You will get 1.2. This is your trial and error method of finding the growth rate. Fine. Now this is one way you can do it. You can simply write growth rate is equal to, in your exam, no, you can write growth rate is equal to 10%. Trial and error. That's it. That's good enough. Or you can use formula also. Remember one formula we used to use to find what is that? trend they have given. No, it's nothing but increase in amount divided by original amount into 100. Any 2 years you take. Don't be a Bruhaspati and take this too. It has to be 2 consecutive years. 2 consecutive years. One has become 1.1. So how much is the increase? From 1 it has become 1.1 means the increase is how much? 0.1. Correct? Divided by original amount. Original amount means previous year amount. How much is that? 1. 0.1 divided by 1 into 100 if you do, you will get what? 10%. That way also you can apply and show this as a working note. Your call. Either directly trial and error or this particular way of presentation. Done, Naji? So growth rate we got to how much? 10%. The moment growth rate comes in, cost of equity through Gordon Chacha. And D0 wala formula or D1 wala formula? D1 wala. Company issued new debentures. Company issued new debentures. That means new debentures means first priority market value or issue price. Okay. How much interest rate? 16%. And the current market price is 96. Sir, we have issued new debentures, but at what issue price? What is the issue price? Given specifically? No. But they have said market value is 96. Sir, if market value is 96 means you will issue it at what price? Market value only. Yes, no. So that means in this problem, IP and market price both are same. How much is that? 96. Or you can use other logic also. IP is missing means next priority, market value. How much is that? 96. Done now. Sir, we read the debenture. Are we given a redemption value given a? No. N given a? N is given a? No. N is missing means it is redeemable or irredeemable? Irredeemable. Irredeemable ka very easy. But straight away we will start or read once the requirement. You need to calculate cost of debt. Anywhere they mention YTM method. No, that means we'll use what? Formula method. What is the formula method for cost of debt? Irredeemable ka. Interest into 1 minus tax rate divided by net proceeds. What is net proceeds here? 96. Or flotation cost? Not given. Flotation cost? Not given. Market value 96. Flotation cost not given. So calculate how much will be the cost of new debt over here. Here, interest, this is the formula. Interest into 1 minus tax rate divided by net proceeds. Interest at 16%. What is the face value of the debenture? What is the face value of the debenture? Given now when face value is not given, it's very easy. They have given market price. How much is market price? 96. So face value will either be, confusion is whether to take face value 10 or 100. 10 or 100. This 96 is closer to 10 or 100. 100. This whatever data they have given, check that number is close to 10 or that number is close to 100. This 96 is close to 100. So face value here will be how much? 100. What is the interest rate? 16%. Interest always calculated on face value. So how much is the interest amount? 100 ka 16% which is 16. 16 into is the interest amount into 1 minus tax rate divided by net proceeds. Here net proceeds, what are we taking? Market value. You do it, you will get cost of debt to be 8.33%. Easy now. Very straightforward one. Next to they are asking us to find out what? Preference shares 9.2 with an annual dividend of 1.1 were also issued. So preference shares are issued at what price? 9.2. Correct? That means here issue price is missing or given? Given. Any flotation cost is there? No. N given for preference shares. N given or missing? If N is missing, it is redeemable or irredeemable? Irredeemable preference shares ka formula. Chapandi. Preference dividend into 1 minus tax rate or only preference dividend? Only preference dividend. How much? 1.1 divided by net proceeds. 9.2. 1.1 divided by 9.2. How much is the answer? Preference shares, I have got 1.1195 or 11.95%. Correct? 11.95% is your KP. Done, Sarji. Next, what is the second requirement? So far, good, no, all of us? No issues. Okay, next, what did they ask? You need to find out, first requirement is you need to find after tax basis cost of new equity shares, assuming new equity is from retained earnings. That means, are we issuing new equity shares or taking retained earnings only? That means, effectively, they are asking what, sir? KR. KR. Since they gave growth rate, which formula? Gordon Chacha. Flotation cost you will consider or ignore? Anyway, flotation cost is not given in this problem. Even if they had given, we would have ignored. So what is the formula? And they have given D0 or D1? D1 we already found out. How much is that? 1.18 divided by P0. How much is P0? Sir, retained earnings we cannot issue. So first priority for retained earnings ideally should be market price. How much is that? 23.60. So calculate Gordon-Chachaka formula. D1 that is 1.18 divided by P0 which is 23.60. Whole thing added by growth rate 10%. 1.18 divided by 23.60 plus 0.1 if you do, you will get the decimal answer. What is the decimal answer? 0.15 or 15%. Okay, Naji. This is your cost of retained earnings as per your Gordon-Search model. First requirement done. This is very, very faltu. Next, what are they asking? They are asking you to calculate marginal cost of capital when no new shares are issued. So that means now you tell me, company is issuing what and all? New debentures, new preference shares and retained earnings. So for these three you are finding the KO. These three you are finding the KO. So we are finding KO for total or only the new instrument. Hence they are calling it as what? Marginal cost. Sir, whether you call it as marginal cost of capital or whether you call it as weighted average cost of capital, calculation is any which way? Same. Done now. So for calculating KO or marginal cost of capital, we need two instruments. What is that? Or we need two things. What are those? Weight of that instrument, cost of that instrument. Yes. Sir, we already know the weight. They told in the previously only, this is the optimum capital structure. That means, will this weightage be changed? No, even after new instruments are issued, the weights will be same. Because this weights will never be changed. Agreed, everybody? Just to tell you once again, suppose company needs 1 lakh money. Suppose company needs 1 lakh money. How will they raise that 1 lakh, people tell me? Entire money will come through debenture. No. Because this weights will be disturbed or not disturbed. So if company needs 1 lakh money, 15% or 0.5 or 1 lakh, how much is that? 15,000 will come through new debentures. 0.5 or 5%. 5% of 1 lakh is how much? 5,000. 5,000 will come through preference shares. Correct? Balance 80%. 1 lakh ka 0.8. How much is that? 80,000 will come through either through retained earnings or new equity shares. Anyway, both belongs to equity shareholders. Correct? So no matter what, whenever you raise money, will this weights be disturbed or it will be maintained? It will be maintained. Because they said in the problem it is considered optimum. Optimum means ideal. So we would not like to disturb that. Done, Sarji. So weights are missing or weights you already know. Here. Weights are missing or weights is this only? Weights are this only. What about cost? Cost just now we found. Cost of, what is that? Here. Cost of debt is 8.33%. Cost of preference shares is 11.9. Retained equity na retained earnings. Retained earnings. Retained earnings ka cost is 0.15. Weights anyway we already have it previously. Take that instrument ka weight multiplied by that instrument ka cost. You will get the overall cost of capital. But will we call this as weighted average cost of capital or will call it as MCC? Because this is the cost only for the new instrument. This is also pretty easy. No change. And this question is LDR only because of the next adjustment. It's the same study material question. We have done it in class also. Read the next requirement. Determine the amount that can be spent. Determine the amount that can be spent for capital investment before new ordinary shares must be issued, assuming retained earnings for next year's investment is 50% of 2017. Now, 1 second. I'll tell you what they're asking. What is 2017 ka EPS? 2.16. Take a calculator. How many shares does this company have? Check, they've only given. Company has how many shares? 10,000. Sir, EPS ka full form is what? Earnings per share. Earnings per share. For 1 share, how much is the earning? 2.36. We have 1 share of 10,000 shares. So multiply. 10,000 into 2.36. How much da? 10,000 into 2.36. 23,600. That is your total earnings. Any problem? Keep your calculator. So far, okay? Now, people, when a company earns the money, they can do 2 things. One, retain that earnings or distribute it as dividend. retain the money or give it as dividend. So here company is retaining 100% or they said 50%. Retained earnings constitutes 50%. That means how much our company earns, 50% they will give it off as dividend, other 50% they will retain. That's what the question is saying. How much did the company earn here? Total basis 23,600. Fully they will distribute or 50% retention. How much is retained earnings? 23,600 ka 50%, which is 11,800. Any problem? This is your total retained earnings. Any doubt? Anybody in this number? Pakka. Now people, do you know the weightage of retained earnings? Do you know weightage of retained earnings? How much? We already know. Sir, retained earnings, equity, both are same because both belongs to equity shareholder. Equity and retained earnings put together, how much is a weight? Equity shares and retained earnings put together, how much is a weight? 0.8. Yes, sir. That means, can I say 80% of total money will be from equity and retained earnings? 80% of the total money. Whenever you require total money, 80% of that money will come through retained earnings. See, I'm writing one sentence. See if that makes sense to you over here. Or maybe I'll write it here only. Retained earnings. Retained earnings is 80% of total capital. Do you agree with me? Retained earnings is 80% of total capital. Yes, sir, people. Any problem? Pakka, 100%. How much is retained earnings just now you got? 11,000? 11,800. Sir, 11,800 is your retained earnings and this is what? 80% of, can I say TC? TC means total capital. Therefore, can't you find out TC for me? How much is that? How did you get 11,800 divided by 80%? 80% is 0.8. How much is that? 14,750. Okay, everyone. Pakka numbers are good. And that's what I've calculated here. Check. So, retained earnings is 11,800 and retained earnings constitutes how much percentage of total capital? 80%. How is this 80%? Is this 80% specifically told to us or hidden adjustment? Hidden adjustment. How? What is that hidden adjustment? They said current capital structure is optimum. When we found out current capital structure ka weightage, retained earnings and equity constituted how much? 80%. Hence, we concluded retained earnings equity put together is 80% of total capital. Correct? Therefore, total capital is how much? 14,750. Good. Now, read the requirement once again if you have not understood. Determine the total amount that can be spent before ordinary shares must be sold. Now, people, retained earnings is unlimited source or limited source? Retained earnings is not infinite number. No, it is only limited. In this particular company or this company rather, how much retained earnings it has? 11,800. Correct? So they are asking up to what level? Up to what level? Sir, whenever company needs money, they will touch one source or three source? Whenever company needs money, they will raise it from three source. What are those? New debentures. New debentures to the extent of 15%. New preference shares to the extent of 5%. Retained earnings or equity, one of them, to the extent of 80%. Correct? So, whenever company needs money, they will raise in this format only. Got it? Now, in the question they are asking, up to what level new equity shares are not required? Up to what level new equity shares are not required? That means what is the source of finance? New debt, new preference shares and retained. Up to what level you can only manage from these sources. And retained earnings is not unlimited supply, it is only limited supply. Correct? No. In this problem, how much was retained earnings? 11,800. 11,800. And retained earnings constitutes how much weight on total capital? 80%. So that means retained earnings is 80% of total capital. Andre, what is that total finance or total capital? 14,750. Correct? Meaning up to 14,750, company can manage only with three sources. What are the three sources? New debt, new preference shares, new equity or retained earnings. If you want cross check, how much is the total capital? 14,750. How much money will come through debt, people? 15%. Take your calculator. I think I've done it over here. Right? If you need 14,750, if you need 14,750, how much money will come through debt? 15%. How much is that, people? Tell. To 14,750 ka 15% or 0.15, your call. 2,000 or 2213, can I say? 5% of the money will come through preference shares. 14,750 ka 5%. How much is that? 730? 737. Correct. Add these two for me. 2956. Okay. That's it. Or even 80% will come through retained earnings. What is 14,750 ka 80%? 11,800. Is 11,800 retained earnings available? Yeah. That means now you tell me what is the total. Add all this. What are you getting? Add all this 3 for me. 1 second. If you add all this, you're getting 14,000. That means tell me up to 14,750 is company required to issue new equity shares or not required? That is what they ask. Up to what level we can manage with debt, preference shares and retained earnings. So that's the answer. That's a requirement and I hope we got it. Pakka? Everybody? Suppose the requirement is 15,000. What will happen? Suppose company needs for new project. Let's take this number. 15,750. What will happen? Suppose company wants to do a new project. How much new project will cost? I'm assuming this is just for your reference. It's not asked in exam. I mean, in the requirement. Just for our reference. Suppose company needs the money of 15,750. What will happen? Up to 14,750. Up to 14,750. Company can manage with new debt, new preference shares, new equity or retained earnings. Retained earnings. Correct. But beyond this, what is these two ka difference? What is these two ka difference? 1,000 rupees. Now level there or level crossed? Level crossed. That means for this 1,000 shares, company will have to issue now equity shares. Full law. No. Company wants to maintain an optimum capital structure. In optimum capital structure, 15% money will always come through debt. 5% money will always come through preference shares. 80% of this new money now will come through retained earnings or retained earnings full damar. Retained earnings is exhausted. That means now 80% of the money will come through new equity shares. So up to 14,750 you can manage with these 3 sources. If it goes beyond that, then the money will come through again 3 sources. Which are the 3 sources now? New debt, new preference shares, retained earnings or new equity. In different ratio or same ratio? Same ratio. This they have not asked, just for your reference we have put it across here. Pakka na ji? Okay. And that means if you can express this in formula, what formula you can tell? If you want to find total capital from retained earnings, how will you find? Take the retained earnings divided by the weight of retained earnings. Retained earnings ka amount divided by retained earnings ka weight. That's what I've written in the chart book there previously. Retained earnings amount divided by percentage of retained earnings. Percentage of retained earnings is nothing but retained earnings ka amount. That's what this formula. By this you can find out the total capital. Okay na Sarji? Alright. Now which question was this pa? Second question. Okay. So this is done now. Third requirement also done now. Now fourth requirement, check again. Compute the MCC. Compute the MCC. I think we already computed MCC here now. Now again they are saying compute MCC when the fund exceeds the amount calculated in C. Sir, as per C requirement, how much can you manage only with the new debt, new preference shares and retained earnings? What was that level? 14,750. Now last requirement they are saying if this level is below this level or not, level crossed. If this level is crossed, then compute MCC. Now you tell me the moment this level crosses, you will raise funds again through 3 sources. What are the 3 sources? New debt, new preference shares, new equity shares. And so that means you are issuing new equity shares. At what price? Check. Assuming new equity shares are issued at 20 rupees. Okay na? So cost of debt, any change are same. Same. We already found. Cost of preference shares also same. But equity shares, no, we have to recompute. Why? Sir, previously when we computed retained earnings, we took D1, we took market price as how much? 23.6. Now, are you issuing new equity shares at 23.6 or 20? 20. That means the price has changed. So your cost of equity will be same as cost of retained earnings, or it will change? Change. So tell me, what is cost of equity ka formula? They've not given dividend paid, they've given expected dividend, and growth rate is also there. Which formula for cost of equity? Gordon's model. What is the formula? D1 divided by P0 minus, don't forget flotation cost. It is not retained earnings, it is equity shares. For equity shares, flotation cost will not come, or it will come. It will come. Whole thing added by the growth rate. D1 may any change or same? P0 is not 23.6. Now you are issuing new shares at what price? Now you are issuing the new equity shares at 20 rupees. So P0 here is 20 rupees. Flotation cost not there. Growth rate is still 10%. When you calculated, you got it as 15.9. Done, Aji. Now for this, we need to calculate MCC. Tell me how. Walk me through. This one, everyone okay, right? Walk me through the MCC process. MCC is also KO, but only for additional. Here, additional funds means what and all? First, tell me that breakup. Preference shares, debt, retained earnings, or new equity shares. But weights are already optimum. Will it be changed or same? Weights are still same. Debt ka weightage is 15%. Preference shares ka 5%. Now, retained earnings or equity shares? Debt ka cost and preference shares ka cost we already calculated, remains the same. But equity ka cost now is not. Earlier when we calculated retained earnings, we got it as 15%. Is it 15% now? This is retained earnings ka cost. Are we using retained earnings or cost of equity? What is cost of equity? 15.9. So take that. That's the only number changed. Weight same. Only equity ka cost changed. So MCC also will change. Same wala drama. This is a good question. Done, people. You need a minute to process anything or fine? So again, if you want to summarize this question, what are the takeaway? One, they said optimum capital structure. So the weights will change or same? Same. That is one. Then they, did we have retained earnings? Yeah. We had how much retained earnings? 11,800. What was equity retained earnings ka weightage? 80%. Of what? Total capital. So if you know retained earnings ka weight, if you know retained earnings ka amount, can you find out total capital? Yeah, how do you get total capital as a formula? Retained earnings ka amount divided by retained earnings ka weight. You did that, you got 14,750. Up to 14,750, we can just manage with new debt, new preference shares, and retained earnings. Up to that level, equity shares, new equity shares need not be issued. But if you need any funds more than 14,750, now you have to issue new equity shares. For the balance amount or still the same weights? Still the same weights. What weights? Equity to the extent of 8, equity shares to the extent of 80%, debt to the extent of 15%, preference shares to the extent of 5%. That's all as a takeaway of this problem. Okay. This is okay. This one, 29th, I'll do it. I think that's all we have. One more, I'll do it over here. Okay, now people. Do remember, it's not the total number of questions we solve. It's about how much you have understood what interpretation basically. Formula to you need to mug up in FM. That is there. That is a pure memory exercise. But when you are applying, you should know what numbers to pick. D0, D1, Gordon Chacha formula, IRR method, what. All these are subtle things. When you read the data, you should be able to interpret that. As long as you are able to interpret, it's fine. Okay. And don't freak out. Some people will be like, sir, ICI has released so many model papers, I have to solve each and everything. Not required. Right? First priority is, I feel always, study material ka questions. Every question. Last 2 to 3 attempts ka RTP, MTP questions. That is sufficient to crack the whole group MC. If you are a rank holder, if you are aiming for a rank, then number of times of revisions you need to increase. Instead of 1 revision, maybe you'll have to make 3 to 4 revisions minimum. Okay. And maybe do a few more questions with writing practice. If passing is your aim, 1 studies, 1 revision should be good enough. But don't blindly mug it up. When you are reading a question, now you should be able to, when you read this question, you should figure out. Now here they said convertible debentures. How your mind should work is, the moment convertible debentures andre concept, what? Optionally convertible, compulsory. Optionally means cash value redemption or share value redemption, whichever is higher. Compulsory means only share value redemption. Like this, you should revise each problem. With each adjustment, you are revising that whole concept again and again for yourself. And not just blindly reading. and then figuring out, so when you are able to revise like this, even one problem if you revise, otherwise even 10 problems are not sufficient. That way. Okay, read this question carefully. A company issues 15% convertible debentures. Did they say anywhere there optionally? So far we have not seen. Fine. How much face value? 100. At par. Face value is 100. Par value means what? Face value itself. That means these debentures ka issue price is also how much? 100. Face value, issue price. Both are same. How much? 100. Maturity period 6 years. Sir, maturity period 6 years means it is not irredeemable. It is redeemable debentures. On maturity, each debentures will be converted. Optionally converted, Allah. Will be converted. So reading the line, I'm getting a feeler. It's not optionally convertible. It looks like compulsorily convertible. For compulsorily convertible, you will take two options ka RV or only one. Which is that? You will take only RV of the share value. Share value. But subtle, small things. Will the debentures be redeemed immediately or after 6 years? After 6 years. Because debentures will get redeemed only on when the term of the debenture comes to an end. Term will come to an end only after 6 years. That means you need equity share ka value now or after 6 years. Since the redemption of the debenture will happen after 6 years, we need RV of equity shares not now, but after 6 years. Basically, we need market value of equity shares after 6 years. Keep that in mind. Now check. Risk-free rate of return is 10%. The moment risk-free rate comes, any formula uses risk-free CAPM model. Okay, so that means using CAPM model, we can find cost of equity. See, if you have all the data, RF is given. Market risk premium they have given. Risk premium andre RM minus RF directly. RM minus RF directly is how much? 18%. Calculate cost of equity for me. Beta is 1.25. How do you calculate? What's the formula? RF plus beta into RM minus RF. What is your calculator showing? 32.5 is the answer you're getting. 0.325 or 32.5%. All your calculators, I hope, is showing. Done now. Okay, what is this 32.5? It is cost of equity. But I think we are not doing, are we worried about cost of equity here or debentures? Debentures. Okay, so far using CAPM, we got cost of equity. Done, let's see. Now check. Sir, company has paid the dividend. Expected dividend. Company has paid the dividend. Dividend paid means a D1 or D0. So 12.76, what they have given is a D0. Okay. 5 years ago, it paid a dividend of 10 rupees. 5 years ago, how much dividend? 10. Now, after 5 years, it is 12.76. Sir, is dividend same every year or looks like increased? So here you tell me growth rate is not there or it is there? It is there. Okay, Naji. Now you can use trial and error method. 5 years back, how much was it? 10 rupees. So what you can do is first take in your calculator. 10 is there, no? 10, maybe first test it out at 5%. Add 5% 5 times. Why 5% you need to add it 5 times? Can someone tell me? 5 years ago, dividend was 10 rupees, no? I am testing if growth rate is 5%. So take 10 and add 5% 5 times. How much are you getting? 12.76. But that means 5% only is our growth rate. First guess only became right. Yes, like this. This is trial and error method. Test it out at multiple rates. If the answer matches 12.76, then that is the right percentage. That's your trial and error. Or in this problem, especially I would say, can you see these two tables? This is PVIF. Present value interest factor. 0.03 means 3%. T is for the time. So how many years ka PVIF they have given? 10 years. At what rate? 3%. Again, they gave it for 5%. These two are your PVIF. This is your PVIFA and this is PVAF. Present value annuity factor. PVIF means present value interest factor. PVIFA means present value annuity factor. That they have given. This is your present value table. Just like present value table, you also have future value table also. Now, whenever they give you, forget about this. Whenever they give you future value table, I would suggest to find growth rate like this. How? Very simple. Sir, how much was the dividend now? 12.76. How much was the dividend 5 years ago? 10 rupees. So, what is the latest dividend? 12.76. 0.76. How much was the dividend 5 years ago? 10. Take the latest dividend divided by the earlier dividend. Latest divided by the old. New divided by old. What are you getting? 1.276. 1.276. So what you have to do is, you have to look for this 1.276 in future value table. Find 1.276 in this future value table. Check. Where is 1.276? Here. Here. Correct? At what rate? 5%. At what rate? 5%. This here is your 5%. This is your 6%. This is your 7%. So that means this 1.276 is matching at which percentage? It is matching at, in fact, this is 5 years. This is actually 5 years. Okay, that's okay. 5 years, 6 years, 7 years. So this is matching at what rate? 1.276 is matching at 5%. So therefore, growth rate is what? 5%. How I want you to write this, do this and then say, referring to future value table. Referring to future value table, growth rate is 5%. Like this, I would suggest you to present an exam. When future value table is given. If this table is not given, then you can do trial and error. And simply write growth is equal to 5%. In bracket, may you write trial and error. If this future value table is given, ideally, I would recommend you to use this info and then get the growth rate. How to do this? Tell me. Latest dividend divided by old dividend, and look for that number in future value table, whichever percentage it matches. As simple as that. Okay, na sir? So growth rate we got. How much is growth rate? 5%. Dividend expected they've given or dividend paid they've given? Dividend paid. How much? 12.76. Growth rate we got it as 5%. Next, what information they've given? Flotation cost is 5%. Okay. Now, one minute. Hang on. Flotation cost of the issue amount. Sir, are you issuing equity shares now or are you issuing debentures? Don't forget, we are not issuing equity shares here. Company is issuing what? Convertible debentures. I mean, this is the flotation cost of equity shares, Allah. This is the flotation cost of the debentures. Goinda, got it. Everybody. Pakka no? So, this is the flotation cost of the debentures. Pakka ji. Now, people, but they gave information relating to cost of equity. Whenever you feel I've given too much of information, I don't know what to do with. No problem. First, solve. They gave CAPM ka data. So, what did we get from that? Cost of equity. Now, looks like they've given growth rate and all, means it is Gordon Chacha. Gordon Chacha ka D naught ka formula you tell me, because they gave dividend paid. So D naught ka formula you tell me. Full you tell me. Cost of equity is equal to D naught into 1 plus growth rate divided by P naught minus flotation cost. Flotation cost don't take Guru 5%. This flotation cost is for debentures, not equity shares. So for flotation cost you cut off. Whole thing added by growth rate. How your mind should run is, we already found out cost of equity using CAPM. That means now when you substitute this cost of equity in Gordon Chachaka formula, you will get P naught. Because P naught is not given. P naught means current market price of the equity shares given a missing. So that is what you need to find here. See, that's what I've written over here. First use, leave this. First you use CAPM model. When you use CAPM model, how much did you get cost of equity? 32.5. Growth rate we already know. How much is that? 5%. What is Gordon Chachaka formula? D naught into 1 plus growth rate divided by P naught. Flotation cost is not there because we are not issuing equity shares here. Whole thing added by growth rate. Now, do you know D naught? Yes. Do you know growth rate? Yes. Do you know cost of equity? Yes. What you don't know? P naught. P naught is your current market price. That means when you substitute, you will get P naught as a balance. That is your current market price of the share. Yes, sir. Either you can use a substitution formula or there is a formula for P naught only. We have done in the dividend decision model. What is the formula? Another formula. If you want to find directly P naught, the formula is D naught into 1 plus growth rate divided by K minus G. We have used this in dividend decision. It's a pure substitute. We want P naught. No. Send G to the other side. It will become what? K minus G is equal to D naught into 1 plus growth rate divided by P naught. Send P naught to the other side, cost of equity to the denominator. So what will be your formula? D naught into 1 plus growth rate divided by K minus G. It's a pure substitute formula. Done, sir. Using this, now what we can find? Price of the equity shares. Understood the flow of the problem? Again, walk me through. What is the first step? Using CAPM model, we found out cost of equity. Using Gordon-Chachaka formula, now we are finding P naught. P naught of what? P naught is current market price of the equity shares. Why do we need this? Because it's a convertible debentures. When you convert the debentures, we will not give cash, we will give equity shares. So you need equity shares ka value. That was not given. So we use this to find. Okay now. That means what is the redemption value of the share option? 48.72. Correct or wrong? Why? Sir, this is the current market price. Is the debenture getting converted now or after 6 years? After 6 years. And what is the growth rate, Chacha? Or you are not Chacha. What is the growth rate, Macha? You are Macha. What is growth rate? 5%. Current market price is 48.72. Growth rate is 5%. And what is the period? 6 years. Now, if the price of the share is 48.72 and if the share ka growth rate is 5%, after 6 years, what will be the price? You simply can do shortcut way. What is that simple way? Take the current market price, add 5%. How many times? 6 times. Because you want the market price after 6 years. Or you can use your mathematics future value formula. What is future? How do you find future value? Present value into 1 plus I whole power n. That also you can use. In math foundation, maybe we used to use this. No? You can use this or simply add this. I would suggest this easy. Right? So what is the price of equity shares after 6 years? 65.28. This is what we wanted. This was the whole drama of this particular question. Not given. Remaining part of the question is nothing. This is the main impact. Okay now. But hang on. They would also give one more. Sir, what is the 65.28? Market value of 1 equity shares. Market value of 1 equity shares. But we are converting what here? Debentures. When you convert debentures into equity shares, for 1 debenture, is it compulsory to issue 1 equity shares or company choice? So what did the company wants to do here? Check. What did they say? Where is it, pa? Somewhere we saw it. On maturity, each debenture will be converted into 2 equity shares. That means if you are owning 1 debentures, you will not get 1 share. You will get 2 equity shares. Yes, sir, people. And this 65.28, what you got is the market value of 1 equity shares. Are debenture holders getting 1 equity shares or 2 shares? So what is the share option ka redemption value? 65.28 or 65.28 ka 2? To why 2? Because on 1 debenture we are giving 2 share. So what is the redemption value of the share option? 130.56. Done. Now use this data in your approximation method ka formula. Now it's simple. Say interest amount missing or given. Given. Tax rate is also given. RV, just now we got it. What is the RV? No, just 130.56 minus net proceeds. They told in the problem these debentures are issued at par. Yeah, par value. So that means how much is it? How much is net proceeds? First priority for NP. If it's a where company is issuing the debentures. So if it's a new debenture, first priority for IP. IP of the debenture missing or given? Given. Yes, sir. So that means net proceeds is how much? 100 or flotation cost. Don't forget flotation cost. How much is that? 5%. 5% of what? Issue amount. How much did you issue the debenture for? 100. 100 ka 5% you do. How much is that? 5 rupees. So that means that's what I've written it over here. Issue price is 100. Flotation cost is 5 rupees. So net proceeds will be 95. N is 6. Substitute and you will get the cost of debt to be 13.23. This is very, very easy stuff. The only crux is to find out the RV. And that too, they had not given price of equity shares. Usually in problem, current market price of equity shares will be given. Here, they asked us to find that. How did we find? First, cost of equity through CAPM. Then again, we find market value of equity shares through Gordon's formula. That was a current market price, but debentures will get converted into equity shares after 6 years. So we need a market price of equity shares after 6 years. That will be the market price of equity shares of 1 share. Debenture holders are not getting 1 shares. They are getting 2 shares. So multiply and then you will get the redemption value. That way, that's what makes this question a little better, I would say. Okay, sir. All right. I think we have one more part of the question that is simple. Preference shares also we have issued redemption. And these are convertible. No. I mean, is there any drama here or straightforward? Straightforward. They are asking us to use YTM method for preference shares. Again, that also we are comfortable. So second part of the question is repeat, nothing much to learn. Only first part of the question was what made this question interesting enough. Okay, sir. Everybody good, sir? All right. I think that's all the time we have. Yeah, should be good. Fine. 2 minutes. You want us to recap the whole thing once again? 5 minutes? Would you think constant recaps is helping you? If it helps, we'll revise and we'll take a break. Otherwise, if you have got it, means I'll wind up. Revise once, I don't mind multiple revision. That's my second name. Okay. Chapter name, cost of capital. Capital here refers to long-term source of finance. Each long-term source of finance, we are trying to find out the cost. Okay, sir? And that is one no. First, cost of debt. Cost of debt, you need to first ask yourself one question, whether it is redeemable or irredeemable. If it is irredeemable, cost of debt is given by the formula interest into 1 minus tax rate divided by net proceeds. Net proceeds, what do you take? First priority for net proceeds is, first you need to check whether it's a new issue or existing. If it's a new, first priority you will take issue price. Issue price missing, market value. That is also missing, face value. If it's an existing instrument, first priority market value. That is missing, face value. If you are not able to find out whether it is a existing or a new, then first priority is still IP. IP missing, market value. Market value missing, face value. But no matter what you take, flotation cost compulsorily you have to reduce. And flotation cost can be calculated on face value or IP, MP depending on the question. If they don't tell anything, calculate flotation cost on the issue price or market price. If they say calculate flotation cost on face value, then only calculate on face value. That is one. Next, if it's a redeemable debt, the formula will be interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. RV is your redemption value. N is your not total life. N is the remaining life. These two methods we call it as approximation method. There is another way to find out cost of debt, that is your IRR method. Here we'll have to assume two discount rates and assume and apply interpolation formula. Interpolation formula is lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower rate. Okay. Now at year 0, you will take net proceeds as a negative number. Then after tax interest for whatever the term. At the end of the term, you will take redemption value. After tax interest and redemption value will be in positive. Net proceeds will be in negative. And directly do it. If you want, first you can solve under approximation method and then assume the discount factor. That is totally your choice. Then if it's convertible debentures, first you will ask a question whether it is compulsorily convertible or optionally convertible. If it's optionally convertible, then you will take cash ka redemption value or share ka redemption value, whichever is higher. If it's compulsorily convertible, you will only take share ka redemption value. Okay, then we went for preference shares. Same drama, substitute interest with preference dividend. You will take after tax or no after tax. So that means if it's irredeemable preference shares, formula will be preference dividend divided by net proceeds. If it is redeemable, preference dividend plus RV minus NP divided by N, whole thing divided by RV plus NP by 2. Or you can use IRR method. If you're going for IRR, at year 0, you will take net proceeds in negative. Then you will take after tax dividend, after tax preference dividend or only preference dividend. Only preference dividend for the duration. Then at the last year, you will take redemption value. Preference dividend, redemption value positive, net proceeds in negative. And then apply interpolation formula. In equity shares, so equity shares ka dividend price approach. Dividend divided by price. This method assumes dividend to be constant. Earnings price approach. EPS divided by NPS. Assumes EPS to be constant. Garden chacha. D0 into 1 plus growth rate divided by P0 minus flotation cost. Whole thing added by growth rate. If the D0 is dividend paid, G is your growth rate. P0 is same. If it's a new shares, first priority, IP. That is missing, market value. If it's existing share, first priority to market price. If they've given D1, the formula will be D1 divided by P0 minus flotation cost, whole thing added by growth rate. One way to find out growth rate is trial and error. Another one, current dividend, latest dividend divided by old dividend. Look for that number in future value table. Or B multiplied by R. B is your retention ratio. R is your rate of return on investment. Another way. Then the CAPM model, cost of equity as per CAPM model is RF plus beta into RM minus RF. RF is your risk-free rate of return, B is your beta, RM is your market rate. Sometimes they'll directly give you risk premium. Risk premium means RM minus RF. Okay, then we looked at Yield to maturity approach or realized yield approach. For that, first check year-wise return given, not given. If it is not given, IRR method. If it is given, first year return 1 plus y1 is equal to d1 plus p1 divided by p0. Second year return denoted by 1 plus y2 given by d2 plus p2 divided by p1. Third year return denoted by 1 plus y3 given by d3 plus p3 by p2. Fourth year return 1 plus y4 given by d4 plus p4 divided by p3. Multiply all the 4 years ka return, find out fourth root. Press the square root buttons basically twice. Minus 1 you do, it's a geometric mean, you will get the cost of equity. Then cost of retained earnings formula is same, but don't use flotation cost. If you are using Gordon-Chachaka formula for cost of retained earnings, don't do flotation cost. Rest everything is same. Then cost of retained earnings is also given by cost of equity into 1 minus flotation cost into 1 minus TP. TP as in personal tax rate. Then what did we learn now? Marginal cost of capital. Overall cost. One second. Then we looked at overall cost of capital, WACC, denoted by the symbol KO. And for this, how do you find this? Take that instrument ka cost multiplied by that instrument ka weight. And this weight can be either calculated using book value or market value. First priority is market value as it is the latest information. Book value is old info. Alright, MCC is also same, calculation is same, but we are finding the KO only for the additional capital, right? And is there a way to find out the total capital using retained earnings? When they say optimum capital ratio is this, how do you find that? Take retained earnings ka amount divided by retained earnings ka weightage. That will give you total capital. Then next, sir, if company ka interest rate and market ka interest rate, if it is not sinking, then debentures will have to be issued at discount. How do you find out the issue price in that case? Actual interest amount divided by the expected interest rate. That is one. And don't forget to reduce flotation cost. By doing this, you only get IP. How do you get NP? Issue price minus flotation cost. And then, is there any shortcut method to find out KD? When RB, NP are same, then should you have to use a big fancy formula? No. Take the interest rate, multiply 1 minus tax rate. For preference shares, what is the shortcut method? Preference dividend itself will be your KP. Okay, I think that's pretty much what we covered. All right, people. Thank you. Hello, people. So now let's quickly revise capital structure topic, continuing in our marathon series. Now, previous topic mein in the cost of capital, what was our objective? To find each source of capital ka cost. In capital structure topic, mein, what is our objective is, which source of finance we should select the money. Now, each source ka cost, you know, cost of equity, cost of debt, everything, you know. Now, which source of finance you should select the money so that the overall cost of capital, as in KO, is minimum and value of the firm is maximum. From which source we should select the money? Should we select the money from equity, preference shares or debt? From what source the company should select the money so that the overall cost is KO is minimum and the value of the firm is maximum. That's the scope of this particular topic. Okay. Now again here also we need to remember a few formulas. One, value of the firm denoted by V or VF is given by the formula EBIT divided by overall cost of capital KO. Or another way to get value of the firm is S plus D. S means market value of equity. D means market value of debt. Usually, finance manager will not prefer to issue preference shares. Why? They'll either go for equity option or debt option. Preference shares is not much preferred. Why? Because if you compare debt with preference shares, debt also you have to pay fixed interest. Preference shares also you have to pay fixed rate of dividend. But on debt, we get one advantage or a benefit called tax benefit, which is not available in case of preference shares. Hence, the finance manager would prefer to raise the money through debt rather than through preference shares. Hence, the value of the firm is given denoted by the symbol S plus D. Preference shares are usually ignored in this. So, these are the two formulas that predominantly we use over here. And one more one is, I've explained you the logic of all this in regular class. Now, I'll not go into the logic. We'll just stick to the magic part. Okay. How do you get value of equity, sir? Using the same formula. Is EBIT available for equity shareholders or what is available? Each is available. So, value of equity S is given by, instead of EBIT, you will substitute with each or another name, net income. KO you will substitute with cost of equity, KE. So that if you do, you will get market value of equity denoted by the symbol S. So these are the three formulas that we predominantly use for the first set of problems. Okay, now can we do a thing? First we will run through everything theoretically and then we'll solve all the questions. Would that be okay with you? All right. Now people, in this particular chapter, there are some theories, some relevance theory, some irrelevance theory. Relevance theory का argument is debt is important. Debt is, or do please, maybe. People who comes the last, make sure that your door is closed. Huh? Thank you, ma. Okay. So relevance theory का argument is debt is important. By taking the debt, this particular theory का argument is if company should take more and more debt, if you take more and more debt, value of the overall cost of capital will reduce and value of the firm will increase. Or maybe before I go into this theory, maybe one more I'll tell you. How do you get value of the firm, people? What is that formula? V is equal to EBIT divided by KO. Value of the firm is given by EBIT upon KO. Now people, this particular KO and value have inverse relationship, ulta relationship, meaning if KO increases, value will reduce. If KO reduces, value will increase. If you want, just check. Suppose KO is 10%, EBIT is 90,000. How do you get value of the firm? EBIT 90,000 divided by KO 10% means 0.1. So you will get 9 lakh. Okay. Suppose let's keep EBIT same, EBIT constant. Value of the firm, let's make it to 12%. What is the answer till now? Instead of 10%, let's make it 12%. What is the answer you're getting? EBIT is still 90,000. Now KO is 12%, means now you're getting 750. Check what happened. From KO, from 10 I made it to 12%. So KOV increase. KOV increase. What happened to the value of the firm? From 9 lakh it became 7.5 lakh. So that means the value of the firm reduce. Hence we say this KO and the value of the firm have inverse relationship. One increases, other will reduce. Okay, na sir? Now coming back to this theory, relevance theory ka argument is debt is important. By using the debt, KO we can reduce. What is this theory saying? By using the debt, overall cost of capital will reduce. And we just now learned if KO reduces, value of the firm will increase. That is the relevance theory ka argument. Sir, how will debt cause KO to reduce, sir? Sir, equity we have, debt we have. Which is a costlier source of finance? Which is a cheaper source of finance? Which is costly? KD is costlier, cost of equity is costlier. Sir, cost, for a company it's a cost. For the investor it's a return. Now, equity shareholders take more risk compared to the debenture holders, correct? Now, equity shareholders take more risk compared to the debenture holders, and risk and return go hand in hand. If you are taking more risk, you will expect more return. So which is a more costly source of finance? Cost of equity will be greater than cost of debt. Debt is rather a cheaper source of finance. All of you through with this? Now people, this theory ka argument is, since debt is a cheaper source of finance, debt is a cheaper source of finance, more and more cheap source of finance if you take, overall cost will reduce. Overall cost as in KO will reduce, which will cause the value of the firm to increase. If you want, we can prove it with a small example. Let's say cost of equity is 15%, cost of debt is 10%. Weightage of equity is 90%, weightage of debt is 10%, 0.9, 0.1. Calculate KO for me. How do you calculate the KO? Take that instrument ka cost, multiply that instrument ka weight. These two you multiply, 13.5. These two you multiply, 1. What is the overall cost of capital you're getting? 14.5. Easy. Now let's assume company wants to take more debt. Company wants to more debt. Let's make it equal. Currently, what is the weightage? 90% equity, 10% debt. Now let's make it equal. 50-50. 50% equity, 50% debt. Check what happens. Cost of equity 15%. Now the weight is 0.5. Multiply these two. How much is it? 7.5. Cost of debt same 10%, but is the weight 0.1 now or 0.5? 50% we made. So these two, if you multiply, you will get 5. What is the KO now? 12.5. What did I do over here? Debt ka value we increased because company took more debt. What happened to KO? From 14.5 it became 12.5. So that's what this particular theory ka argument is. Since debt is a cheaper source of finance, more and more debt you use, overall cost of capital will reduce. If KO reduces, obviously value of the firm will increase. That is what relevance theory ka argument is. Understood, sir? Any problem? Now, under relevance theory, again, these are for 1 or 2 marks ka theoretical question. They don't directly ask you much. It's there. Quickly, 2 minutes we are running through. So, under relevance theory, we have two: net income approach, traditional approach. Net income ka approach ka argument is very simple. Same. Debt is a, compared to equity, debt is a costlier or cheaper source of finance. Compared to equity, debt is a cheaper source of finance. More and more debt you take, what will happen? Overall cost of capital will reduce and the value of the firm will increase. So that is what this theory argument is. So this theory assumption is KD and cost of equity. Cost of debt and cost of equity will be constant. Okay. You can take how much ever loan you want, whether you want to take 1 rupee loan or whether you want to take 100 crore loan. Cost of debt will remain same. That is this theory assumption. Practically outdated. Nobody will accept it. Taking 1 lakh loan and taking 100 crore loan same. 1 lakh loan, maybe you can take it at 10%. But 100 crore loan, bank may say, I will give it to you at 15%. If at all they say they will give or not. Yes or no? So obviously based on the amount, the cost of debt also will change. But this theoretical argument is both KD and KE will remain constant. Yes sir. This is about net income approach. Traditional approach ka argument is, traditional income is agreeing to one point. What is that it is agreeing is, compared to equity, debt is a cheaper source of finance. Compared to equity, debt is cheaper. But what traditional approach says is, debt will not be forever cheaper. Debt will not be forever cheaper. Debt will be cheap only up to a certain level. Debt will be cheap only up to a certain level. That means, let's say people, for my company level is 50 lakh. Let's assume for my company level is 50 lakh. That means up to 50 lakh, I can take the bank loan at a different rate or same rate? Same rate. Suppose I told a banker I need 10 crore loan. What is my limit? 50 lakh. Okay, I've already taken a loan of 50 lakh. Now I went to bank manager and saying, Kudra Machat, 10 koti loan. 10 crore loan. No? Yeah, I'm asking. Now you tell me, just because I took 50 lakh loan at 10%, will I be able to take 5 crore loan also at 10%? Will bank manager be comfortable? No, he may say, boss, I'll give you a loan, but not at 10, but I will give it to you at 12%. Possible? That is what this theory, traditional approach is saying. Debt, no doubt, is a cheaper source of finance, but debt is cheaper only up to a certain level, not forever, only up to a particular level. After that, check, initially I took the loan at 10, now I'm taking it at 12. So after that level is breached, cost of debt will increase. Okay. And taking debt is a risky affair, no? Taking debt is a risky affair. Why? Sir, if you take money from equity shareholder, if company takes money from equity shareholder, is there any obligation to pay dividend every year? Should the company pay equity dividend every year? No. Should the company repay the money back to equity shareholders? No. So there is no obligation to pay dividend. There is no obligation to repay principal. But imagine the same thing. If I take a bank loan, every month or every quarterly or every year I have to pay EMI. If I don't pay, what will happen? Can I tell banker no profit, no EMI? They will say Tata bye. They will tell call the company assets and they will auction, sell. Yes or no? That means debt is a risky affair. Yes, no, people correct. The moment company borrows too much of debt, the moment company borrows too much of debt, what happened to the risk of the company? Same or increase now? More and more debt company takes, the risk of the company will increase. If risk increases means, will equity shareholders expect same return or higher return? So what traditional approach argument is, up to a certain level only you borrow debt because it is cheap. Once the level is crossed, cost of debt also will increase. Cost of equity also will increase because business has become risky. If these two increases means your overall cost of capital also will increase, which will cause the value of the firm to reduce. So traditional approach is saying use debt carefully. Don't just borrow just because it is available. Use debt judiciously or carefully. That's all is this. Then Sarji. Again, not that very important for exam. Move on to the next. Okay. Next one. No. Next is irrelevance theory. Irrelevance means not relevant, like our classes. Absolutely not relevant. Okay, nah. So that is what irrelevance theory ka argument is. Debt is absolutely irrelevant to the value of the firm. What irrelevance theory is completely opposite they are saying. whether the company takes debt or whether the company does not take debt, value of the firm will be same, unaffected or not affected. That is what this particular theory ka or irrelevance theory ka argument is. So by taking the debt, can the value of the firm be changed or no impact? No impact. That's what irrelevance theory ka argument is. Under irrelevance theory, the first theory is net operating income. So what is net operating income trying to say is, again, not very important. 1 or 2 points at best can come as theory. You may have to call it out. I'll spend 1 or 2 minutes and move on. Now what net operating income approach ka argument is, sir, debt is a cheaper source of finance. Compared to equity, debt is a cheaper source of finance. If you take more and more cheap source of finance, what will happen to overall cost? Reduce. If KO reduces, value will increase. This is one part. Agreed? Now, irrelevant net operating income says not only this, one more thing will happen simultaneously. Along with this, one more thing will happen simultaneously. What is that? The moment company takes debt, business ka risk same or risk increases. The moment company takes debt, business becomes risky. The moment business becomes risky, equity shareholders will expect same return or higher return. So the moment you take debt, the cost of equity will increase because the business has become risky. If cost of equity increases, one cost increases means overall cost also will increase. And if KO increases, value will reduce. So this theoretical argument is these two will get netted off. Whatever value increase you saw over here, same thing will happen as value decrease over here and both will get set off. Both will get netted off. Hence the value of the firm, any increase, any decrease or same. See, that is what net operating income theory ka argument is. Done, Sarji? Yes, sir. So as per net operating income approach, KO, any change or no change? KO may check. First it will reduce, then it will increase by the same amount. Any change or no change? That means as per this theory, few things are constant. Read this and tell me, or you take a guess, what are the things constant? KO and the value of the firm will remain constant. Dana Sarji. What will keep changing? Cost of equity will keep changing because more and more debt you take, cost of equity will go on, increasing. So KE will change, but KD and KO will remain same. And even the value of the firm also will remain same. And EBIT also same. That is the argument of this particular theory. Okay, na sir? Now, under irrelevance theory, there is one more sir, MM. Modi-Giuliani-Miller approach or MM approach. Anybody remembers formula? Yeah, MM approach. Sir, MM sir is batting both for relevance and irrelevance theory. He's batting. He's on both the sides. He's a political party. One's left to one's right. Yeah, he'll keep jumping. So, MM sir ka argument is, if there is no tax rate, Habibi country, if you're operating in Dubai, no tax, no. Right? If there is no tax in your country, then the value of the levered firm and unlevered firm will be same. Value of the levered and unlevered firm will be same, and both the firm ka KO also will be same. KO means overall cost of capital. Levered firm means what, people? Levered firm means that firm which has taken debt. Unlevered firm means that firm which has not taken debt. If a firm has taken any debt, means we call it as levered firm. If they have not taken debt, we call it as unlevered firm. If there is no tax rate, then both the firm ka KO and value will be same. If by chance tax exists, then by chance tax exists. Now, 1 minute. This is what, sir? Now you tell me, debta, no debta, value increase or value same? One firm has debt, one firm does not have debt. Both their value different or same? I mean, this under no tax, MM sir is arguing for which theory? Irrelevance theory. Whether you take debt, whether you don't take debt, value of the firm will be same. But by chance, if there is tax, by chance if tax exists. Now, what MM sir is saying is, on debt, we have to pay interest. On interest, we always get the tax benefit. That means, now you tell me, if there is tax rate, both the firm ka value can it be same? Unlevered firm has no debt. Levered firm has a debt. I mean, levered firm will get one extra advantage called tax benefit. So, if there is tax, MM sir is saying, value of the levered firm. Levered firm andre, that firm which has taken debt. Value of the levered firm will be equal to value of unlevered firm plus the tax benefit or tax advantage. Okay, now people. So, these two values are same or different? different. I mean, now it comes under which theory? Under tax environment, sir is arguing for relevance theory. Done, sir. So how do you get this tax advantage or tax benefit? Take the total debt and multiply by the tax rate. Take the total debt and multiply by the tax rate. Then you will get the tax advantage. Sir, you get tax benefit on interest, no, sir? Yeah. But you get interest you will pay only once here, only once throughout, or you will pay for every year. You will pay every year. Hence, tax advantage or tax benefit is given by total debt multiplied by the tax rate. Any problem in this so far? All okay? That means sir is arguing both for relevance as well as irrelevance. Irrelevance comes under which approach? No tax scenario. Relevance comes under which scenario? Tax approach. Once again, call it out for me. If there is no tax rate, value of the levered firm, unlevered firm will be same. Both the firm ka KO, overall cost also will be same. But if there is tax, if tax exists, then value of the levered firm will be equal to value of the unlevered firm plus the tax benefit. And how do you calculate this tax benefit or tax advantage? Total debt multiplied by the tax rate. Okay. Now one more formula is quite important. Of late, we are seeing a lot of questions coming in exam using this. We have also done at least 5-6 questions using this particular formula. Once I will discuss this, considering it is important, I will do one more question now in the revision using this particular formula. Okay, here. Now, people, if they have given cost of equity of the unlevered firm, listen to this carefully. I know you should be able to remember in case you have forgotten. Once again, I'm calling it out. If you know cost of equity of the unlevered firm, unlevered firm means we are denoting in the symbol KEUL. UL means unlevered firm. Again, unlevered firm means what, sir? Debtor, no debtor. If a company has not taken a debt, we call it as unlevered firm. So there is a connection between what? Sir, if you know cost of equity of the unlevered firm, from that you can find cost of equity of the levered firm also. Levered firm ka cost of equity is denoted by the symbol KEG. Or if you don't like the symbol, you can write like this only. Cost of equity of the levered firm. Like that also you can present the equation. But this is the format they use. KEG means levered firm ka cost of equity. KEUL means cost of equity of the unlevered firm. Now, if you know cost of equity of the unlevered firm, you can also find out cost of equity of the levered firm, which is given by the formula. First, take the cost of equity of the unlevered firm plus cost of equity of the unlevered firm minus cost of debt into 1 minus tax rate divided by equity. In fact, I have proved this formula to you in regular class. It's not really a formula. It is just a substitute. You know WACC ka, right? It is just a substitute of that. I don't have time to prove that formula and all now. Okay, we have done it in regular class. For now, anyway, not our intention also. What will you do with proving the formula? They will not ask you to prove formula in exam. What you need to only is remember the formula and solve. So let's focus more on the exam related things now than worrying about why of things. That's not the time anymore now. Oh, okay, tell me people once again, how do you get cost of equity of the levered firm? First, to take the cost of equity of the unlevered firm plus, open the bracket, cost of equity of the unlevered firm minus KD into debt into 1 minus tax rate divided by equity. D here is market value of debt. E here is market value of equity. And here people, KD is not cost of debt. Though formula says KD, here KD is not cost of debt. It is the interest rate. It is the interest rate. Okay. What is the difference? Tell me cost of debt ka shortcut method. Cost of debt ka one-liner method. Interest rate into 1 minus tax rate. Interest rate into 1 minus tax rate. So if you do interest rate into 1 minus tax rate, you're going to get KD. So this is not KD. Though the formula says KD, what is it here? Here, interest rate. Why here is, sir, on interest you get the tax benefit. We are already multiplying 1 minus tax rate over here. Again, if you multiply 1 minus tax rate over here, it will be double benefit. On one debt, you will get 2 times tax benefit or once. Since you have already multiplied 1 minus tax rate over here, again here we can't take 1 minus tax rate. Hence, we have to take interest rate. Agreed? So, everybody cool? This formula you will apply when tax exists. When there is no tax rate, tell me. This 1 minus tax rate will come or it will not come. Only cut off that. Rephrase that formula once again for me. How do you get cost of equity of the levered firm? Cost of equity of the unlevered firm. Plus, open the bracket, cost of equity of the unlevered firm minus KD. KD here means interest rate. Into debt divided by equity. Anyway, one tax rate is not there. Even if you multiply 1 minus tax rate anyway is 0. 1 minus 0 is what? 1. Even if you use this formula for no tax scenario, answer will be any which way, same. Done, Ajay. This is important. Pay attention to this. We have seen a lot of questions on this coming in lately. Now, again, all these are approach, people. Whenever question says approach, remember, if you're stuck, some students find it difficult with respect to approach. When approach gets asked in the question, the trick will be, or the way to proceed will be 3 formulas. 1, if there is no tax rate, levered firm and unlevered firm ka value will be same. Their KO also will be same. That is 1. You should remind yourself of that. Second, when there is tax rate, value of the levered firm will be unlevered firm ka value plus the tax benefit. And how do you get tax benefit? Total debt multiplied by tax rate. That is 1. Another one is this. These formula. These 3 there will be solution. Okay, so if you are not able to proceed, at least try to put this formula and see where it goes. More or less the question will be solved. If you are stuck, I'm saying. Done. Now, going one step back again. Sir, if there is no tax rate, MM sir is arguing for irrelevant or relevant theory? Irrelevant theory. What is MM sir ka argument when there is no tax rate? Levered firm and unlevered firm ka market value should be same. Should be same when there is no tax. By chance, if it is not same. By chance, if it is not same. There is no tax rate. Market value of the levered firm, let's say, is 100 lakh. Market value of the unlevered firm is 95 lakh. These two should be different or same? As per sir, it should be same. Is it same or not same? If it is not same, then an investor, not a company, an investor can do something called arbitrage. An investor can do something called arbitrage. Arbitrage is a process which is done to get some gain. Arbitrage is a simple process it's an activity done to get some extra gain. Who does this? Company or investor? Investor. When you will do this? When these two firm ka value should be same. But is it same? No. When they are not same, then only you can do something called arbitrage. There are 4 scenarios of arbitrage we have done in regular class, 4 problems also, right? 1 I will take you through over here, another 3 orally we'll try to explain using that. Why not, people? This is a number game. Even if I tell now, it will not make sense. We will discuss that when the problem comes. Done now. But now you know the meaning of arbitrage. What is the meaning of arbitrage? If there is no tax rate, both ka value should be same. If it is not same, only if it is not same, then only an investor can do something called arbitrage. Arbitrage is simply some extra activity done by the investor to get some extra gain. Okay, so far this is good enough. All right, can I move on to the next one? Again, this is also not much. People in FM also 2 to 3 marks, you could say roughly around 3 to 4 marks also sometimes comes at theory level. Straightforward theory it is. So if you can try to, whatever I've called it on the chart book, at least that much of theory try to remember, it's better. Because if the theory comes, it will be pretty straightforward. And aram say you can do 2-3 marks, waha. You don't have to do anything. Hardly it takes 1 minute to write it. Okay, rare, but 3-4 marks you can expect. Now, pecking order theory. Pecking order theory, what it says is, sir, different people in the organization have access to different set of information. Now, you are in ArivuPro Academy. I am also in ArivuPro. Both of us know same information about Arivu now. Both of us know same information about Arivu, or I will know little better information. I will know little better information. Yes, no. That is what pecking order theory says. Different people in the organization have access to different sets of information. At manager level, you will know something about organization. At director level, you will know little more. Yes, no. So that's what pecking order theory says. Now, as per pecking order theory, what this theory says is, you select money from that source of finance. You pick money from that source of finance which reveals maximum information, which gives maximum information. Whichever gives maximum information, prioritize and pick the money from that source. And as per pecking order theory, first priority, whenever company needs money, first priority should always be retained earnings. Next priority should be debt. Last priority should be given to equity. First priority, why do we give it to retained earnings? Is, sir, about retained earnings, is there any mystery left or we know everything? How do you get retained earnings? Whatever profit you have made in the current year, from that you reduce all the dividend. Whatever remains only we call it as what? Retained earnings. Any more information you need to know about retained earnings, or you know full information? So which source is giving you maximum information? retained earnings. After it, hence first priority to that. What is the next priority? Debt. Last priority what? Equity. Why does pecking order theory give last priority to equity? Is, sir, equity shareholders are risk takers. So they will expect same return or their expectation will keep changing. In the good scenario, in the recession environment, they will expect less return, equity shareholder. When the things are good, they will expect a higher return. When COVID and all happened, people were be like, okay, let me get my money back from share market. Enough. But later when they started printing more money and Sensex went up, then everybody will like, I want 40% return. I want 100% return. Right now, so equity shareholder expectation will never be same. It will keep fluctuate. Yes, no. That means from this source, you will have full information and not so. You will not have much information because it is dependent on the market condition. And market condition, you cannot predict 100%. Hence, last priority to the equity as per pecking order theory. Done, Ajay? Okay, this is not important. Okay, this could be important. Financial break-even point. Or for class purpose, we used to call this as FBP. Financial break-even point means what is? What, listen to this carefully, what should be EBIT? What should be the amount of EBIT so that EPS becomes 0? What should be your EBIT amount so that your EPS should become 0? For EPS to become 0, what should be EBIT? That's what financial break-even point is trying to calculate. Break-even point means no profit, no loss, no? Correct? Financial break-even point means EPS should be 0. Operating break-even point means EBIT should be 0. In leverage, operating leverage uses operating break-even point. Here we are not talking about operating break-even point. You are talking about financial break-even point. Financial break-even point means what should be EBIT so that EPS should become 0. Done. So in this financial break-even point, we have to find out EBIT. That's the crux of this question. Now, people, when the company needs money, 3 sources of finance are usually preferred. What are those? Usually only 3. Equity. Equity here includes new equity shares and retained earnings. That is one source. Second, preference shares. Then, debt. Now, financial break-even point for 100% equity plan. Meaning, company has raised the money only from one source. What is that? Equity. Equity here refers to equity share capital and retained earnings. If you're finding financial break-even point for 100% equity, then only if EBIT is 0, only if EBIT is 0, EPS also will become 0 under no other circumstance. I've taken 3 different examples if you remember in regular class and I proved it. We changed different numbers. Again, not important for the time being. So time being, you just need to remember the final answer. What is the final answer? If you want to get EPS 0 and if it's a 100% equity plan, what should be your EBIT? If EBIT is 0 means EPS also will be 0. If EBIT is even 100 rupees, EPS will not be 0, it will be something else. Okay, now this is for what sort of a plan? 100% equity plan. Next is not 100% debt plan. You can't have 100% debt plan. You could say more like here. This is equity plus debt plan. This is equity plus debt plan. If the company has raised the money as equity plus debt. For equity, what is financial break-even point? 0. But here only equity is there or even debt is there. Even if debt is also part of your capital structure means then for EPS to become 0, EBIT should be exactly equal to interest charges. If interest charges is 10 lakh means EBIT also should be 10 lakh. Only then EPS will become 0. If interest charges is 5 lakh means EBIT exactly should be 5 lakh. Then only EPS will become 0. If EBIT and interest charges does not match means you will not get EPS as 0. You will get something different number. Again, we have proved all this. Now, let's not go into that proving exercise. This is for what people? What sort of a capital structure we are talking about here? Equity and debt. Last will be what? This will be equity and preference shares. This will be equity plus preference shares. So, in this case, for you to get financial break-even point, EBIT should be equal to, okay, what was the debt ka financial break-even point? EBIT was equal to interest charges. In the same grounds, if you build it up here, what should be the EBIT? EBIT should be equal to preference dividend. It is not EBIT equal to preference dividend. It is EBIT is equal to preference dividend divided by 1 minus tax rate. Preference dividend divided by 1 minus tax rate. Why is that? Sir, when will you pay preference dividend? Before paying tax or after paying tax? After paying tax. That means if you want to get EPS as 0 means two things company wants to recover. What are those? Tax also, preference dividend also. Only then EPS will become 0. That only is expressed as a shortcut formula as what? Preference dividend divided by 1 minus tax rate. Proving, no, now don't have to go into that. If you want the proving, I think video access is given to you. You can watch that. But exam time, what will you do with proving? Leave. Okay now people. So preference dividend divided by 1 minus tax rate. Suppose if you have all the three, Andhra, company has taken equity shares also, preference shares also, debt also. That means now add all the three. What is equity ka EBIT? Financial break-even point 0. So ignore that. For debt ka interest charges. For preference shares ka preference dividend divided by 1 minus tax rate. So add these two, that becomes your financial break-even point. So what is it? If all the three exist, if all the three exist, then financial break-even point is given with the formula interest charges plus preference dividend divided by 1 minus tax rate. This is rare. We don't usually see this much in exam. If at all they ask, you need to club this. Usually they will ask these separately. We'll solve one question also now on this. Done now? Clear. Can I move on to the next one, people? Next one is indifference point. Go one step back again. Previously, what was the concept? Financial break-even point. Financial break-even point means what are we trying to find here? We are trying to find EBIT so that EPS becomes 0. Indifference point means what should be EBIT? What should be the EBIT so that both the plans give same EPS? 0 EPS Allah. They give same EPS. Two plans gives same EPS. Like here, let's say company needs 10 lakh money. How much money? 10 lakh money. Company has two options of raising that. Entire 10 lakh they can raise through equity. That is plan number 1. So plan or plan A. What is plan A? 100% equity. Any debt or no debt? No debt. Second plan, 50% debt, 50% equity. First plan is what? 100% equity. Second plan, 50% equity, 50% debt. I've just assumed this for explanation. A plan could be anything, right? So we have one plan here or two plans? Two plans. What is indifference point trying to calculate us? What should be the EBIT so that both these plans give same EPS? Whether you go for plan A or whether you go for plan B, EPS will be same. Such level of EBIT only we call it as what, sir? Indifference point. That's the meaning of indifference point. It does not make a difference. Indifference is that only, no. It does not make a difference. And here also see, will it make a difference? Whether you go for plan A, in plan A, if you get 0.5, if you get 2 rupees as EPS, in plan B also you will get how much EPS? 2 rupees. That means whether company goes for plan A or plan B, EPS number any which way will be same. That's what indifference point is trying to calculate. Done now. That's given by fancy formula. Anybody remembers? Now what is that? EBIT minus I1 into 1 minus tax rate minus preference dividend divided by E1 is equal to EBIT minus I2 into 1 minus tax rate minus preference dividend divided by E2. Okay, this was the thing. We are equating this. Why? So basically this formula is what? What is this numerator denominator? EPS ka formula. This is nothing but by doing this, what are you going to get? First plan ka EPS. In indifference point, mein first plan ka EPS and second point ka EPS will be different or it will be same? Same. Hence, first plan ka EPS we equate with second plan ka EPS. The same EPS. Now, what is the normal formula to get EPS, people? Normal way to calculate EPS. Each net income or each divided by number of equity shares. Earnings attributable to equity shareholders are also referred to as net income divided by total number of equity shares. If you do that, you will get EPS. This is that only. If you want, just check. So what do I want for my numerator check, people? What do I want? Now here, tell me. Or first maybe we'll take this. From EBIT, if you reduce interest, what are you going to get? EBT. Is EBT available for equity shareholder? No. First you have to pay tax. After paying tax, what are you left with? EAT. Is this available for equity shareholder or first you have to pay preference dividend? Deduct preference dividend. How much money remains? This number is this 53 is available for whom? Equity shareholder. This only we call it as EASH. EASH means earnings attributable or earnings available to equity shareholder. This number you take and divide by the number of equity shares and you get EPS. Correct? That's how you do it. Same thing we are getting. Now, what is this formula trying to calculate is? From here, it is trying to get here. From EBIT, it is trying to arrive at ish. So tell me now, what is the formula? From EBIT to get ish, first what we have to do? First, you have to reduce interest. That's what is the formula. EBIT minus I1. I1 means we have one plan here or two plans. I1 means interest under plan number 1. Okay, sir. So from EBIT, if you reduce interest, what are you going to get? Earnings before tax. From EBT, you have to reduce tax and get what? EAT. Now from EBT, directly you can jump to EAT. From here, you can directly jump to EAT. How? Just simply you do 1 minus tax rate. If you want, you do over here. What is EBT in this problem? 90. What is earnings after tax? 63. So directly do the jump approach. Take EBT and you do 1 minus tax rate. EBT is 90,000. Tax rate is 30%. 90,000 into 1 minus tax rate, if you do, what are you getting? 63,000. That's the reason in our formula we are multiplying 1 minus tax rate. Now tell me, what is this formula deducting? From EBIT, if you reduce interest, what are you going to get? Earnings before tax. From earnings before tax, if you do 1 minus tax rate, what are you going to get? Earnings after tax. We need earnings after tax or ish. Hence also reduce what? Preference dividend. So by doing this, numerator is simply what? Ish. E1 is nothing but number of equity shares. We have one plan or two plan? We have two plans over here, no? So E1 means number of equity shares of the first plan. Done, sir. And now both the plan will have different EPS or same EPS? Same EPS. Now you tell me second plan ka EPS new formula? This alphabet wala formula? EBIT minus I1 or I2 now? EBIT minus I2 into 1 minus tax rate minus preference dividend divided by E2. In this problem, every data will be given except EBIT. Solve this equation and then get EBIT. That will be your indifference point ka EBIT. That's all is this. Clear, sir? Now people, what is the synopsis of this? I've also proved you this also considering various numbers. If time is there, I'll also maybe once more prove it to you. Otherwise, I'll just tell you the synopsis. Sir, at indifference point, let's say you got indifference point EBIT is, let's say, 1 lakh or maybe okay. You solved this equation, no? You solved this equation and got how much EBIT? 1 lakh of assume. That is what people, indifference point ka EBIT. So at indifference point, which plan should I choose? Plan A na plan B, or it does not make a difference? At indifference point, what is my EBIT, sir? At indifference point, what is my EBIT? 1 lakh. So if my EBIT is 1 lakh, if my EBIT is 1 lakh, I can go for plan A or I can go for plan B. Doesn't matter. EPS will be same because that is the very meaning of indifference point. At indifference point, both the plan will give you same EPS. That means which one can I choose? Anything. It will not make a difference. That's the first point. At indifference point, you can choose any plan. Both the plan, any which way will give you same EPS. Okay. Now here I have assumed, carefully read this. What is the indifference point EBIT I have assumed? What is the indifference point ka EBIT I have assumed? 1 lakh. Okay, sir. This is the ideal number. If EBIT is 1 lakh, if EBIT is 1 lakh, you can go for plan A or you can go for plan B. Both will give you same EPS. Now, suppose people, you are doing a particular project. We are doing a particular project. Project will give us some return. No? That we are calling it as EBIT. Suppose we got a particular project ka, EBIT only 80,000. Only how much, sir? 80,000. Sir, what is this 1 lakh? Are you able to appreciate the difference between 1 lakh and 80? Tell me, what is the difference between 1 lakh and 80? 1 lakh is the ideal number. 1 lakh is the benchmark. Okay. Like 50% means CA pass. 50% means CA pass. That is the ideal number. You may cross 50. I don't want to say the other one. You may be little lesser than 50 also possible. So this 1 lakh is the ideal number or a benchmark. Okay, but an actual project ka EBIT can be 1 lakh. It can be more than 1 lakh or it can be less than 1 lakh also. Now, which scenario I have taken here? Because when you raise the money, for what joy will company take money? To do a project, no? And project will give you some return. So you did a project, and how much EBIT you are getting from that project? 80,000. What is the ideal number? 1 lakh. Now you got ideal number or lesser? So if project ka EBIT which is lesser than indifference point EBIT, what did I say? If a particular project ka EBIT, if it is lesser than indifference point ka EBIT, in that case mein you will always select that plan which uses higher equity. Below indifference point, you will always select that plan which is using more and more equity. Now you tell me people, if project ka EBIT is 80,000, if project ka EBIT is 80,000, whether you will go for plan A, plan B, or it does not make a difference. If once again I'll give you the data. What is the data? Indifference point EBIT how much? Indifference point. Oh, what happened there? Indifference point EBIT is 1 lakh. But the actual EBIT, how much I have taken? 80,000. And now you tell me which one will you go for. First tell me once again the theory. Now, okay, or are you above indifference point now, or are you below? Below. You are below 1 lakh. No, you did not achieve 1 lakh. We achieved only 80. So you are below indifference point. Below indifference point, what is the theory? You will always select that plan. Here we have one plan or two plan? Two plan. If you are below indifference point, then you will always select that plan which is using more equity. More equity, because that plan will give you higher EPS. I proved it to you in regular class with numbers. Now I will not prove. No time. Or we'll see. And now you tell me, theory I have told you. If this is the data, means whether you go for plan A or plan B. Plan A or plan B? Plan A. Why? Plan B is using only 50% equity. Plan A is using 100% equity. So which is using more equity? Plan A. So that means in this case, you will go for which plan? Plan A. So what that's final answer is? You will select what? Select plan A. Done now. Now can we take the other scenario? Sir, what if the actual project ka EBIT is 1,50,000? Again tell me, what is the difference between 1 lakh and 150? 1 lakh is the benchmark, ideal number. 1 lakh is the ideal number. But a project, when you do a particular project, you may get an ideal number, or you may get lesser than ideal, or you may get more than ideal. That means now you are below indifference point or above? You are above indifference point. That's what is the next point. When you are above indifference point, you will always select that plan which is using higher debt. Above indifference point, you will always select that plan with a higher debt, because that one will give you a higher EPS. That's a theory. Once again, call it out for me. Which scenario? Above indifference point. Above indifference point, select that plan which is using more debt, because that plan will give you higher EPS. Theory. Okay, now you tell me, sir, if this scenario plays out, these two, you will go for plan A na plan B na. Indifference point is 1 lakh. Actual project ka EBIT is 150. Now you are below indifference point or above? If you are above indifference point, what is the theory? Select that plan which is using more debt, because that will give you higher EPS. First plan is using any debt or zero debt. Second plan is using some debt. So among these two, which is using more debt? Plan B. So what is the final answer over here? You will select what, sir? Select plan B, because by doing so, you will get higher EPS. Okay, na? If you want, you can assume random numbers and prove this, or refer the class video. I think one question we have done on this to prove this also. Maybe I'll see if we can possible. I'll try to do it now. Then, sir, that's your indifference point ka synopsis. Okay. Maybe I think one more we have. We'll discuss and we'll go for problems. Another one is small concept called overcapitalization, undercapitalization. Overcapitalization. Name only is saying overcapitalization. Overcapitalization means borrowing more than what is required. Suppose we need, let's say ArivuPro, we need 10 lakh rupees money. We want to open a new branch. How much money we need? 10 lakh. We borrowed 10 crore rupees. How much we need? 10 lakh. How much did we borrow? 10 crore. Sir, why, sir? We are crazy. So, okay, yeah, crazy. Yeah, that only. So, that scenario is what we refer to as what, sir? Overcapitalization. Meaning borrowing more than what is required. Now, you tell me, if you need a 10 lakh, if you borrow 10 crore, can we utilize 10 crore fully or only keep it idle? keep it idle. That scenario is what we call it as overcapitalization. Now tell me what should be the remedy over here if it's overcapitalization. Should I keep the 10 crore or return back? That is what the remedy is, okay? So basically causes of overcapitalization is too much of borrowing at a higher rate. What is the remedy? Go for reorganization, meaning whatever extra money you have taken, give it back. Whether it's a debt or equity, return it back. Now overcapitalization ka ulta is what? Undercapitalization. Now people, let's say in this classroom, I can accommodate, let's say 200 students. Let's assume. They're actually counting now. Okay. Let's say we can accommodate, or maybe okay. We have gone with the example. We can accommodate how many students? 200 students. Sir, 500 people have called us for enquiry. Face to face. How many people? 500. But I have seats how much? 200. Got the scenario now. Ideally, this is a bad scenario for ArivuPro or good? Bad. If more people come, more money for us only, no? I can go on a better foreign trip. Correct, no. Right, if more students comes means for ArivuPro, bad, good only. Good only, no? Obviously, sir, we don't do charity, no? We collect money from you, no? Only marathon is free. Rest also you thought free, rest is not free, kadiyadu pa. For rest we take money. Only marathon is free. Done now. Now, how many students are inquiring and want to join? 500. But how much can we accommodate? Ideally, if I'm a finance manager, what should I do? Maybe host 2 batches, or maybe expand the classroom and try to accommodate 500. We told, meda, 200 only. We don't want to give coaching for 500 people. We want to coach only 200. Why? Again, crazy. Yeah. That scenario is what we call it as what, sir? Undercapitalization. There is a demand. There is a lot of demand. But are we fulfilling it or not fulfilling? So ideally what we should do? We should take more money and do an expansion. Take another building on rent, or expand this classroom, or do morning, evening batch. Something we should do so that we can accommodate that particular demand. If you don't do that, it will lead to what case? Undercapitalization the scenario. Now, in undercapitalization scenario, that means people, now you tell me, demand is for 500 students, but we are fulfilling only 200. That means there is a good demand. So we will charge less fees or more fees. Lot of demand, no? You're already economic students. Yeah, if there is more demand, price will be increase. That means ArivuPro will offer the course at lower price or higher price. Higher price. Don't spread rumors. Just an example. So now ArivuPro, if you want, we can charge more price. That means we will earn less or we'll earn more. We'll earn more. But we have expansion plan or no expansion? That means what will I do with my earnings? Will I keep it or distribute to shareholders? Because if I have no plans to expand, what is the point in keeping it as a retained earnings? Because I have no plans to expand. So how much ever we earn, we will distribute dividend. So in undercapitalization scenario, dividend payout ratio will be on the lower side or higher side. Dividend payout ratio will be quite high. That is one you could say. 2-3 points you have to write when it comes as theory. In the chart only I mentioned what and all you need to kind of remember and write. Now people, how much is the demand? How many students? 500. How much did we accommodate? 200. What about balance 300? They need coaching, no? Is ArivuPro giving? No. That means competitor will come. There is a lot of demand. We are not fulfilling it. So another academy will come. So that means in undercapitalization scenario, whose entry will happen? Competitor entry will happen. Okay, na Sarji? That's a simple meaning. Okay. Done. Again, not that very important. 2 points, in case it comes as a theory. Fine, sir. Except arbitrage, we have covered almost everything. Can we have a quick recap and then take up the questions? Few questions. Okay. Chapter name, what people? Maybe for your reference, I'll just show you the chart once again. Capital structure. What is the overall scope of this particular topic? Select that source of finance. Select that source of finance which will make the overall cost to be as minimum as possible. Where KO is minimum, which will cause the value of the firm to be maximum. That's our objective. KO should be minimum, value should be maximum. Choose source of finance, keeping that as a main objective. Okay. Next, here we learnt a few formulas. So what is that first formula? Value of the firm V is given by EBIT divided by KO. One is that. Another way, value of the firm is given by S plus D. S for market value of equity. D for market value of debt. And S is for market value of equity. How do you get market value of equity? S. Can I take EBIT? Is EBIT for equity shareholder? What is available? Each. So in the numerator, you will take each. Denominator, KO or KE? KE. Yes, people? Alright. Now in this particular topic, we studied some relevance theory, irrelevance theory. Relevance theory ka argument is debt is important. By taking the debt, you can change your KO. Accordingly, your value of the firm also will change. So under relevance theory, first theory was net income approach. Net income approach ka funda was very straightforward. What is that? Since debt is a cheaper source of finance, use as much debt as possible. More and more cheap source of finance if you take, since debt is a cheaper source of finance, overall cost will reduce and value of the firm will increase. Because there is an inverse relationship between what and what. KO and value of the firm, there is inverse relationship. If KO increases, value will reduce. If KO reduces, value will increase, like that. What about traditional approach? Traditional approach ka argument is what? It agrees that what? Debt is a cheaper source of finance. But will it be cheap forever or only up to a certain level? So use the debt only up to that level. Because after that level, cost of debt will increase, cost of equity will increase, which will cause overall cost to increase and value to reduce. 11.2 in case if it comes as theory in exam. Okay, next is irrelevance theory. Under irrelevance theory, we had net operating income approach and MM approach. What is net operating income approach ka argument is? Debt is a cheaper source of finance. More debt you take, overall cost will reduce. If KO reduces, value will increase. This is one aspect. Along with this, one more will happen simultaneously. What is that? Since debt is a risky affair, the moment you take debt, business ka risk increase. If risk increases, cost of equity, expectation of equity shareholder will increase, which will cause overall cost to increase, which will cause value of the firm to reduce. This value increase and this value decrease will get offset and value of the firm will remain same. KO also will remain same. KD also will remain same. Only number which will keep fluctuating is cost of equity. That is as per this particular theory. Now next, MM approach. MM sir is batting both for relevance and irrelevance. That's based on the tax. If there is no tax rate, then MM sir is saying value of the levered firm and unlevered firm both will be same. Levered firm means that firm which has taken debt. Unlevered firm means which has not taken debt. If there is no tax, both the firm ka value will be same. If it is not same, an investor can do something called arbitrage to get some gain. If there is tax rate, then value of the levered firm will be equal to value of the unlevered firm plus the tax advantage. How do you get tax advantage? Total debt multiplied by the tax rate. This is one. Another one. Can you find out cost of equity of the levered firm if unlevered firm ka cost of equity is given? Yes. Cost of equity of the levered firm is equal to cost of equity of the unlevered firm plus open the bracket cost of equity of the unlevered firm minus cost of debt into 1 minus tax rate divided by equity. Though here we say KD, is this really KD or interest rate? Interest rate, because 1 minus tax rate is already multiplied here. If there is no tax rate, cut off this 1 minus tax rate, rest of the formula will remain same. Okay, next what? Pecking order theory. What does pecking order theory said? Different people have access to different level of information. Always select that source of finance which reveals maximum information. And as per pecking order theory, which source gives the maximum information? Retained earnings. So first priority for money should always be retained earnings. Then debt. Last to equity. Then financial break-even point. Financial break-even point means what should be the EBIT? What should be EBIT so that EPS becomes 0? So that depends on what kind of a plan. If it is 100% equity plan, then for EPS to become 0, EBIT also should be 0. If it is equity plus debt plan, EBIT should be equal to interest charges. If it is equity plus preference shares plan, then EBIT should be equal to preference dividend divided by 1 minus tax rate. If you have all the three, then financial break-even point means EBIT should be equal to interest charges plus preference dividend divided by 1 minus tax rate. Whatever number you get, that should be the EBIT. Only then EPS will become 0. Next, indifference point. Indifference point means whether you go for one plan or whether you go for second plan, EPS will be same. What should be the EBIT so that both the plan will give you same EPS? So indifference point is given by the formula EBIT minus I1 into 1 minus tax rate minus preference dividend divided by E1. This is plan number 1 ka EPS equated with plan number 2 ka EPS expressed in alphabetical way. What's the formula? EBIT minus I2 into 1 minus tax rate minus preference dividend divided by E2. Okay. All right. At indifference point, if project ka EBIT is exactly equal to indifference point ka EBIT, if project achieved exactly that level, then you can go for this plan, or whether you go for that plan, answer will be, or EPS will be same. At indifference point, you can select any plan, answer will be same. If you are below indifference point, if your actual project ka EBIT is lesser than indifference point ka EBIT, then you will always select that plan which uses higher equity, because that plan will give you higher EPS. If your project ka EBIT, if it is greater than indifference point EBIT, meaning if you are above the indifference point, then you will always select that plan which uses higher debt, because that will give you a higher EPS. Okay, under capitalization, over capitalization, chiller. Over capitalization means borrowing more than what is required. Causes is too much borrowing. Remedy, repay. Under capitalization, borrowing less than what is required. In these firms, the dividend will be more, and even your competition ka entry also will be more. And done, people. With this, all this concepts we have covered. Okay, can we now run through a few questions? We have some time, so yeah, we'll try to run some 3-4 questions maybe. Can we try? Okay. I'm trying to pick, in my opinion, those questions which has repeated more. Okay, that's my, and which also covers the concepts, whatever we have discussed. Like that, I'm trying to select the questions. Okay, look at this. Question number 5. I'm as much as possible, I'm trying to take the questions from study material also, so that even our other students who have not taken the class from us, they also try to get benefited. So all those questions you'll be finding from, most of them are study material. In fact, our class note is study material plus RTP, MTP. That's all. Nothing new is there in our class notes also. But any which way. Okay, look at this. Alpha limited, beta limited are identical except for capital structure. Only their capital structure is different. Other than that, they are all same. Alpha has 50% debt to 50% equity. 50% debt, 50% equity. Beta has 20% debt to 80% equity. Only their capital structure is different. Rest everything same. All percentage are in market value terms. Borrowing rate for both companies 8%. In a no tax world, tax is not there. Capital markets are assumed to be perfect, meaning information is freely available. Now, requirement to you as an investor, if you own 2% shares in Alpha, if a particular investor owns how much shares? 2%. Sir, when they say shares, it is always equity shares. Of which company? Alpha. Determine your return if company has a net operating income. So, operating income ka another name is EBIT. If they say operating income is nothing but your EBIT. So, Alpha ka EBIT is how much given? 3,60,000. So, they are not asking company ka return, they are asking investors ka return. And investor owns how much percentage shares in this Alpha? 2%. EBIT is 3,60,000. Overall capitalization of the company KO is 18%. So, this is what they have given. And they also asked implied rate of return on equity. Implied rate of return on equity is nothing but your cost of equity. So, basically, they are asking you investor ka return as well as cost of equity. Now, people, if you are not able to proceed here, no, some students will be like, how to proceed? Just in your mind, recap the formulas. We have learnt a few, right? First, how do you get value of the firm? EBIT by KO. Here, see, EBIT given no, KO given no. So, you can find value of the firm. Possible. Then, value of the firm has one more formula. S plus D. S plus D. Here, do you know the composition? 50% equity, 50% debt. S also you can find, D also you can find. Value ka 50% is equity, value of firm ka 50% is debt for Alpha. Yes, sir. Third one is what? What is S? How do you get S? E is divided by cost of equity. Cost of equity we need to find. But hang on. S is equal to basically what, people? E is or net income divided by cost of equity. Agreed? This is how you get market value of equity. Agreed? Now, people, S you already know. Because if you know value of the firm, 50% of the value of the firm is equity for Alpha. So, S you already know. Can you find out net income by any chance? Net income is Ish. How do you find Ish? From EBIT can you find Isha? From EBIT can you find Ish? How? From EBIT you reduce interest. You get earnings before tax. Tax is anyway 0. You'll get earnings after tax. Preference shares not there. So EAT only will become EASH. I mean, this also you know. Can't you find out cost of equity? Substitution. That's all. 3 formulas, if you recap, you know how to do it. That's all we'll have to do. First do them as a working note and then solve. Done now. Can we quickly review now? Okay, first, they have given EBIT and they have given KO. With these two, what we can find? Value of the firm. Check. We don't have to solve. First, we'll do it for alpha. How do you get value of the firm? EBIT divided by KO. EBIT 360, KO given 18%. So, what is the value of the firm? 20 lakh. Till here, any problem? Now, alpha, they only told 50% equity, other 50% debt. Me or question? Question. That means you tell me, people, if value of the firm is 20 lakh, if total value is 20 lakh and 50% equity, 50% debt means what is market value of equity? 20 lakh ka 50%, which is how much? 10 lakh is market value of equity, 10 lakh is market value of debt. That's your next working note. Alpha. Done now. Now you know S. To find cost of equity, again S ka formula is what? Each divided by cost of equity. S we know. Cost of equity we don't know. But can we find each? Yeah. They've given EBIT. From EBIT we can find each. So that's your third working note. Net income, or you can also call it as each. How do you get issue? First take EBIT. What is EBIT of this firm? 3,60,000. 3,60,000. From EBIT you have to reduce what? Interest. How much is the debt, people? Don't reduce 10 lakh. 10 lakh is a debt too. We need to reduce interest. This firm can borrow at what rate? They've given check. Both the firm ka interest rate or borrowing rate is 8%. How much is the debt value? 10 lakh. What is the interest rate? 8%. 10 lakh ka 8%, how much? 80,000. That is your interest. By doing this, you will get earnings before tax. There is no tax. That means same thing will be earnings after tax. Since there is no preference dividend, same thing will be net income or each. How much? 2,80,000. Any problem? And now substitute. How do you get S? What is that formula for S? Net income divided by cost of equity. S you already know. What is the value of S? 10 lakh. What is the value of each? 280. S is, or in fact, if you want, this is given, this is given. We need to find what? Cost of equity. What's the formula for cost of equity? If you want to substitute, send this to the other side, send this to the other side. So what will be the formula? Therefore, cost of equity is net income divided by S. Correct, na sir? Or you can use this formula only and cross multiply and get the answer. What is net income we got now here? 280. What is S we got it here? 10 lakh. So 2,80,000 divided by 10 lakh will give you 0.28 or 28%. So that's the cost of equity. One of the requirement of the question. Any problem? Next, they also ask, that's it, or also investors return. Investors return. How much percentage shares investor was owning this at? 2%. Correct? Sir, he's an equity investor here, he or she. Right? Equity investors will get a share in EBIT or EASH. What belongs to equity shareholder? EBIT or EASH? How much is the EASH of this alpha? We already found. Net income or EASH is how much? 2,80,000. This 280 lakh is for one shareholder or all the shareholder? I mean, this 2,80,000 is for 100%. Is investor owning 100% or 2%? So what is their share? 2,80,000 ka 2%. 28 2s are 56. So 5,600. That's it. Give you a minute. Observe. Sorted, huh? And now we'll have to do probably the same. Can we go for B? The other one now? This was alpha. Now they check the same question. They say beta ka you have to calculate. Beta has same net operating income as alpha. That means beta ka EBIT is also same. How much is that? 3,60,000. Determine the implied required return on beta limited. Implied equity return means they're asking us to find out cost of equity. Any different or same? Beta also has same operating income, same KO. So first step you tell me, sir. If you know EBIT and KO, what you can find first? Value of the firm. What is the value of the firm ka formula? EBIT divided by KO. If you do it, you'll get same. How much? 20 lakh. But beta ka equity debt same. No, beta is using 20% debt and 80% equity. So can you find out D and S over here? What is market value of debt? 20 lakh ka 20%. How much is that? 4 lakh is a market value of debt. Equity is 20 lakh ka 80%. 16 lakh. That's the second working out. Same thing. Yes, sir. But to apply that S formula, we need two components. What are those? Net income and cost of equity. Cost of equity we don't know. S we found out. That means we need what here? Net income. Net income ka another name? Ish. From EBIT can we find Isha? Yeah. First, what is EBIT? 3,60,000. Reduce interest. How much debt this firm is borrowing? 4 lakh. Interest rate is, they only told 8%. So 32,000 interest. So your Ish or net income will become 3,28,000. Substitute and you'll get cost of equity to be 20.5. Done, Sarji? Any problem, Sarji? And this is proving with our theory also, if you just check. Which approach here? They said net operating income approach. Net operating income approach is relevance or irrelevance theory? Irrelevance theory. What did the irrelevance theory ka net operating income argument was? Debt is same. Cost of debt is same. Here also 8. That's the reason both the firm ka interest rate different are same. Same. Value of the firm also any change or no change? No change. Irrelevance theory, no. So both the whether you take more debt, you take less debt, overall value will be same. Correct. And one more approach, net operating income said, what is that? Or maybe leave that, it's okay. And in fact, one more also you can prove that if under net operating income approach, EBIT, KO, KD, EBIT, KO, KD, and even value of the firm, all this will be constant. All this will be same. That's the reason all this we are using different data, same data. Check here, all these three are same. No change. Only cost of equity, the theory said, cost of equity will change. Here check, how much is it? 28. Here is how much? 20.5. And it is common sense also. Check here, people. And they ask the reason also. They're asking us to analyze. Why is cost of equity changing? Can someone tell me? Why here it is 20.5? Why here it is 28? What is the reason? Why it is 20.5 and 28 here? Why is it not same? Perfect. So taking debt is more risky. Taking debt is more risky. Now, this firm, Alpha, is using how much debt? 50%. Meaning 10 lakh worth of debt they are taking. Beta is taking 10 lakh debt or only 4 lakh. So, here 10 lakh debt, here 4 lakh debt. Which firm is using more debt? Alpha. Taking debt is risky. If Alpha is taking more debt, Alpha firm compared to Beta has more risk. Firm Alpha is risky compared to Beta. That means equity shareholders of Alpha will expect less return or high return? High return. That is the reason Beta ka equity shareholders are only ready to settle for 20.5. Because Alpha ka risk is higher, Alpha ka equity shareholders are expecting more return. Hence 28. That's what you need to write. The reason why it is not changing, why it is not same is both the firms are using different debt. Alpha is using more debt, hence cost of equity of Alpha is higher than cost of Beta. That's what I've written it as a synopsis over here. Clear, sir? That's a justification. One problem done. No? Can we review a few more? If you want some more time to review the question, I'll wait. Or if you feel I'm comfortable, I'll move on. The numbers looks okay. Conclusion part. What are? Tell, show or what? Show. Cost of equity of Alpha and cost of equity of Beta is differing because Alpha and Beta are using different levels of debt. Since Alpha is using higher debt, cost of equity of Alpha is higher than Beta. Next question, Okay. Next, people, let's take up arbitrage. We said, right? We have not discussed arbitrage. So one question, I will take you through arbitrage. Pay attention. There are 4 problems which can come. It's study material question only. This 6, 7, 8, 9 in our class notes. But we will not have so much time to go run through everything. And one is good enough. Only few points are different. So one I'll take you through, observe. Or you want to do this at the last and cover the first. Can we first maybe cover off the things we have done so that we can recap them and then come back to this? Okay, maybe remind me then if I forget. Okay, now people, you remember in approach, was there any linkage between cost of equity of the levered firm, cost of equity of the unlevered firm? Yeah, there was one formula. Tell me, reiterate that formula for me. Call it out. Cost of equity of the levered firm is equal to cost of equity of the unlevered firm plus open the bracket, cost of equity of the unlevered firm minus cost of debt into debt into 1 minus tax rate divided by equity. KD here is not cost of debt, it is interest rate. Then now application is this problem. Can we review? It's a same, I think same question is there in your this attempt RTP also. Okay, I think they've just changed the name and some values. Pretty much the same. Now check. Blue Limited, an all equity financed company. All equity financed company means 100% they are taking the money from equity. Debt is there or no debt? No debt means it's a levered or unlevered firm. UL firm. UL firm andre unlevered firm. Currently, this firm is considering repurchasing 275 lakh rupees 275 lakh. I mean, this 275 is the value of equity shares and replace it with 15% debentures of the same amount. Currently, they have only equity shares. Now, what is the plan of this company? To buy back the equity shares. Buying back means cancel the equity shares worth how much? 275 and substitute with debt. That means now, will they, after they do this exercise, will they still be unlevered firm or now they will become levered firm? Because now they want to substitute with the debt. How much is the debt value? Same amount. Same amount andre 275 lakhs. Current market value of the company is 1750. Currently, what sort of a firm is this? Unlevered firm. And unlevered firm ka current value is 1750 lakh. With cost of capital, how much? 20%. Done, Aji. Now, everyone just observe. Currently, firm has what and all? Only equity. Only equity. That means, can I say here, currently, KE is equal to KO is equal to 20%. Do you agree? Because only source of available with the company now is cost of equity. How do you calculate KO? Weights multiplied by the cost. 100% equity means what is the weightage of equity? 1. So that means cost of equity itself will become overall cost of capital. That's a current setup. Do you agree with me? Because other than equity, we don't have any other source of finance at all currently. Yes. The company's EBIT are expected to remain constant in future years. Oh, it's okay. Tax rate how much? 30%. As per approach, you need to calculate 3 things. Market value of the company. So market value given, no sir, 175. This is the market value of the unlevered. Now they're planning to repurchase, no, and substitute with debt. Now it's a levered firm or now it's unlevered firm or levered firm? Levered firm. Once the company issues debt, they will become levered. That levered firm ka market value they're asking. This is the market value of the unlevered firm. Now we have to find out market value of the levered firm. Also they are asking us to find out KO. Done. And they're also asking cost of equity. All this you need to find after the firm has traveled from unlevered firm. It has become from UL. It has become L firm. Done, sir. Now, when you see such questions, suddenly things will not click. How to start? You'll not be able to hold the pen and be like, tuck. No, it doesn't work. It works for accounts and few subjects. But for FM, no, hands will not freely move. Because there are multiple formats, so multiple formulas, so many things, so much of drilling, so many questions. So in this chapter only, we must have solved like at least 40 questions. And when we have solved so many things, suddenly we'll not remember. So the best way to come out of that rut feeling is approach. There are only 3 formulas for approach. Recap that once for your, in exam, recap it in your mind. Now you can call it out. How do you get? If there is no tax rate, both the firm ka value should be same. 1 minute, people. Here tax rate is there. That applicable, not applicable. Cut it off. Next, what is the next equation? If tax rate is there, how do you get market value of the levered firm? Take unlevered firm ka value given 1750 plus tax benefit. Tax benefit, how do you get? Total debt multiplied by the tax rate. That is also given. I mean, you can easily do up the first step. What is first step? That. Can we do off that? No. And then proceed further maybe? So what is the first step, people? Finding out the market value of the levered firm. How do you get levered firm ka market value? Take unlevered firm ka market value and add the tax advantage or tax benefit. Currently, what is the market value of the unlevered firm? 1750 lakhs. So that's your unlevered firm ka market value plus tax benefit. How much debt they want to take company? 275 lakh. Multiply by the tax rate. That's your tax benefit or tax advantage. So what is the value, people? 1832.5. Done now. They also ask us to comment. When they say comment, you just say how much it was before, how much is it now, and they just call out. How much was the value of the firm before? Before replacing with the debt, value of the firm was 1750. Now it has become 1832.5. So that means value has reduced or increased? Value has increased. By how much? From here, it has become this number, it has become this number. So what is the change? 82.5. That's all. Done now. Second formula, we recapped it and we solved it. Now next, what is any other formula is there? They anyway ask cost of equity. Right? Now it's an unlevered firm or levered firm? Levered firm. 1 minute. Now we need to find out cost of equity of the, what firm is this now? All this is for the, all this we have to find out for the levered firm. Agreed? Clear? Now people, is there any connection between cost of equity of the levered firm and cost of equity of the unlevered firm? Is there any formula linkage? Yes. Now before this particular buyback option, company had only one source of finance, which was what? Cost of equity. So what was the overall cost of capital they had given? 20%. Actually this is KO. This is KO. But only one source of finance is there. Therefore KE and is equal to KO is equal to 20%. Done now. This is what? This is what? Levered firm ka or unlevered firm ka? Unlevered firm. Sir, unlevered firm ka cost of equity, if you know, can't you find out cost of equity of the levered firm? There's one anyway formula linkage. Yes, that formula. What is that again? You tell for yourself. Cost of equity of the levered firm is equal to cost of equity of the unlevered firm. That's cost of equity of the unlevered firm minus cost of debt. Finish. Yes, sir. Unlevered firm ka cost of equity, how much kana? 20%. Minus cost of debt. What is the cost of debt here, people? Cost of debt here is the actual cost or interest rate. How much is interest rate? 15%. You can take decimal or you can take directly percentage. If you take percentage, final answer also will be in percentage. If you take decimal, final answer will be in decimal, which you have to convert it into percentage. Your choice. Into debt into 1 minus tax rate divided by equity. Yes, sir. But one second, hang on. Before you substitute this formula, what you need D and you need equity. I mean, you need to put one working note. What is that? You need a market value of debt as well as market value of equity. I think debt is already given. It's very straightforward. What is that? Or in fact, directly also you can do it. What is the debt value? 275. Correct? No. So debt ka value you already know. How much is that? 275 into 1 minus tax rate. What about equity? That also if you want you can do it one line. What is the market value of the company? Just now we got what is the market value of here? One minute. Alright. The market value of the company now is 1832.5. 1832.5. Sir, second equation. Tell me that second equation. V is equal to S plus D. V is equal to S plus D. If you know V, if you know D, can't we find out S? How do you get S? V is equal to S plus D andre. S is equal to V minus D. What is D? 275. Reduce automatically, you will get 15. That is what is the next working note I put over here. V is equal to S plus D. V you already know. D you already know. Therefore, S will be these two come minus, which is 1557. If you don't want to do this working note, directly you can show like this also. That's also fine. Done, sir. And that way you will get cost of equity of the levered firm. Cost of equity of the levered firm. How much was the cost of equity before? Before you did this exercise, cost of equity was 20%. Now it has become how much? From 20, it has become 20.61. Reduced or increased? Increased. Because you have taken more debt now. The moment you take debt, business becomes risky. If business ka risk has increased, means equity shareholders will expect same return or higher return. Hence, from 20, they are expecting 20.61. This is a change. Done, sir. So, three things they asked in the problem. What are those three things? Market value of the company found. Cost of equity found. Overall cost of capital is KO na people. And that is very, now we have after the firm has become levered firm, it has one source of finance or two sources. What are those? Debt to equity. Now you can use that KO ka table. डेट का मार्केट वैल्यू यू नो, इक्विटी का मार्केट वैल्यू यू नो, डेट का कॉस्ट यू नो, कॉस्ट ऑफ इक्विटी ऑल्सो यू नो. So either use the WACC का table and get it, or use formula. What is formula? What is that one-liner formula? KO is equal to weight of debt multiplied by cost of debt plus weight of equity multiplied by cost of equity. Okay, now people. Weight also, how do you calculate? That is also very straightforward. Total market value, how much? This. In this, how much is the market value of debt? 275. So how do you calculate that? Out of 1832.5, 275 lakh is through debt. So how much is the market value, people? 275 divided by 1832.5. How much you going to get? Weight is 0.15. Agreed? That means equity ka weightage will be 0.8. Either use table approach KO ka, or simply use one line of formula. And you will get the KO to be 19.09%. Okay, na sir? That's all. Is a good question. So whenever you get stuck, best way, format and formula you try to recollect. That will definitely give you a guidance as to how to proceed. If you're not able to at least solve the question fully, at least 50 to 60% of the question you'll be able to solve. Worth it. And people don't freak out. I've seen so many students, we keep telling this time and again, but still maybe once you go to the examination hall, you become different person, I think. Suddenly you will expect too much from you. Right? I do understand where you come from. Maybe since you are in CA intermediate level, maybe still come in. What usually happens is, sir, usually when people shift from that 11th grade to, let's say you have done from 11th grade or 12th grade, you did BCom and then you have come to CA. In 11th to 12th and all, they'll be all, many of them will be scoring in 90s or 95, 100 on 100. So our score will be quite high. I'm sure, I think these days it is common to score 100 on 100, correct? BCom also, let's assume that you have scored quite well. They're laughing. Sir, we never attended class. We were full calm. Yeah. Especially when you shift from 12th grade to CA, there is a drastic shift. Shift which has happened, but the mentality will not shift. Students will be still like, I want 100 on 100. It doesn't work like that in CA. Because time. It was always think 3.5 hours ka paper you need to attempt in 3 hours. That means you already have how much shortage? 30 minutes shortage. So when you have already shortage of time, and so many of us don't have so much of writing practice. Most of us try to review the questions. 1 or 2 we will solve, others we will keep on reviewing. And even if we are solving it, we will take our own sweet time, black ink, red ink, chikki and yeah, we'll keep dilly-dallying there. Yeah, most of us have that habit to draw the lines, so neatness and all that. You have to forget all that. Throw literally the pencil scales out. It doesn't work out anymore once you come to the inter-level onwards. So time we'll forget. So keeping those parameters in mind, right? In CA level, 60 is equivalent to scoring 100 on 100 in your previous level. 60 is because you need to be really good in terms of your preparation, in terms of your time management for you to score above 60. It's not that easy. Paper is not difficult. You should also, many of the times you know the answer, but still you will not be able to write it because of lack of time. And sometimes, people, right? And I think this, not even sometimes, many times. The moment we see, we took first question. The first question I always say is a killer. That first 16 marker question, we will write. We see 1.5 hours gone. Oh, 16 marks attempted. How many? 1.5 hours gone. Remaining 1.5 hours, 84 marks to be attempted. And now full rocket. Now what and all you'll write, it's like my handwriting. Yeah, you will go on writing. And when that pressure hits you, right, we start forgetting the basics of basics. Something which we can do it in our left hand. Somebody who's a lefty who can write in our right hand. That also we will forget. So that pressure can kind of bring you down. So you need to learn to manage that with the help of writing mock papers. Ideally, this is the time to write some mock papers to sort that out. If you are not in that category, if you're still preparation is pending, okay, no comments, let's try the best. Okay, that's all I would say. Fine. So considering all these parameters, I feel, okay, go easy on yourself. 1 or 2 mistakes if you do, don't freak out. Just say expected. One word. Just say part and parcel of the course. Mistakes are expected. You don't have to overthink, because the moment you think I did a mistake, then you'll start forgetting what you're about to do next. If you're thinking about mistake, you'll start doing more and more mistakes. We don't want that, right? Even if you feel, well, sometimes we know that we did a mistake. We'll get to know a little later. When we're writing the paper only, after 15 minutes, you know that this is wrong. It's okay. Learn to forgive yourself. Don't take it to the heart. It's okay. It happens. Okay. Chalo macha. Let's move on. Convince yourself. So let that pressure not get you. And to pass the examination, marks required is only 40. Aggregate mein 50. So ICA is only telling 50% of the things you can go wrong. 50% of the things you can go wrong. I will still make you chartered accountant. Means ICA only is saying it's okay. I am happy even if you are 50% cooked. Doesn't have to be 100% cooked. Only 50% is good enough. So go easy on yourself. It is good. 60 is amazing marks. 50, 55 is also amazing marks. You are a chartered accountant. You will be a chartered accountant. Fine, Sarji. So go little easy. Preparation wise, go hard on yourself. As much as possible, try to cover up. But when you come to the examination hall, last 2-3 days, especially before the exam, go little easy on yourself. Say that few things can go wrong. I might forget few things, right? Or some new question may come, new adjustment may come. It may come, Allah. It will come. Why may Allah? It will come. I'll only tell you. 20 marks, it doesn't matter whom you have taken the coaching at all India level. 20 marks in every paper, every attempt will be a new setting. It will be altogether new question. No teacher would have done that. Because every teacher mostly does study material and RTP. If that question is not even there in study material and RTP, how will that teacher also do it? But I'll go and create these questions. Covering existing question only full sweating. So much they've added. Now we'll go on creating new questions and solve. No. So like that, some 15 to 20 marker will come. So don't worry about that. Focus on the other part which you are comfortable. And go little easy on yourself on the examination day. And after the paper is over, no postmortem. No postmortem. 1 mark, 2 mark, 3 mark. Lekka pakka, you can do it later. Yeah, you don't have Rashtra. So you do it once the paper is done. Do not do it when the exam is over. Come back and do it. Psychologically it will pull you down. You can't do anything about it. Throw the paper. Best. Tear it off. Yeah, imagine FM. Sandesh, what did you teach? Nothing. Yeah, put it on me. It's okay, fine. Best. Right? But that paper should not be in your sight, because many people, we are not mentally strong. The moment we see the paper, we'll be like, at least once. 5 minutes. 5 minutes. Then you will go to YouTube. Somebody would have done review. Right? You will see that review. Oh, MCQ going da. Why all that required? Chumma psychologically very, very back foot. You are unnecessarily putting it. Not required. What you can do, even if you scored out in MCQ. Big deal. Over, no. Leave it. That attempt, best according to me, throw it off. Burn it. Throw it. Whatever you want to do it. But the paper should not be with you. Later you can download from ICA website. If you want. ICA posts it there. Best. So, aram se. Go a little aram se yourself on those examination days. Not now. Now you go bonkers. Whatever you want to do. Right. On the examination day, little easy on yourself. Okay, people? Alright. But I'm pretty sure it will happen. Keep this calm. It will work out for you. All of us have become chartered accountants. You believe that I'm a CA? Thank. Yeah, fine. Sometimes when we shave, they'll say, you're CA? Yeah, CA only. Yeah. Alright. Though we cleared very, very long time back ago, but the pressure and the things has not changed. Right? Now also, like I qualified in 2012. Probably more than 14-15 years back now, right? The pressure it was at that time. Now I see pretty much same, or maybe it has increased. Because you people have your social media ka drama, no? Right? No, Papa, you're worried now. I did not pass means how will I show my face on my social media? That is the problem for us. No, for us that was not much issue. Because we all had a touch phone. Touch phone, keypad, a dial phone, so you just call. So most of us, I think, post CA only, I think we started using the I think back then only smartphone came. Otherwise, mostly it was a touchpad phone only. So that way our social media was little fine. Facebook and all, everything we had to log in through desktop. Who will log in through desktop every time? No, that'll be boring. So we were little away, half an hour, 1 hour we used to spend and come back. But for you, everything you're holding, dunya tere mutti mein types, no? Everything is in phone only. Takku bat, everything. That's a blessing as well as a biggest curse. Right? Because she's saying curse only. Give me your phone, ma. I'll keep your curse for you, please. I'll auction it for you if you want. All right. So that's the thing. So overall, that's all I'm trying to say. As much as calm you can keep yourself, the better chance you are giving for you to crack that examination. Go. All right. So this particular problem, we solved this pending. You also don't know. You also forgot. I also forgot. So I think this one is done. Okay, we'll move on to the next one. This one is also a popular question. They keep altering this in one way or the other, but it keeps coming in many forms. But more or less the benchmark is same. So 14, it's again a study material question, quite popular. So let's see what we can learn from this question. Couple of hidden things are there. Read the question carefully. Now, PBIT, you can call it as EBIT or you can call it as PBIT, one and the same. How much? 52 lakh. From that, they have reduced interest, PBT they've got to, EPS they've got to, P ratio. Sir, how do you get P ratio? Name only there is P ratio, macha. Contribution. Where is contribution coming? Da? Not operating leverage, macha. P ratio, da. Name only there is formula. Price earning multiple. So it is nothing. Price here refers to MPS. E here refers to EP. From MPS, if you divide EPS, you will get price earning multiple. How much is that? 10. What is the meaning of P multiple is? If company has an earnings of 1 rupee, if company has an earning of 1 rupee, if company has an EPS of 1 rupee, investors are willing to pay 10 rupees of that earnings to buy company ka shares. For 1 rupee earning, investors are willing to pay 10 rupees. That's what P multiple tries to calculate. Now people tell me, if P multiple you know, EPS you know means can't you calculate MPS? How do you calculate MPS here? P multiplied by EPS. These two you multiply. 25. That's your market price. That's the data they've already given. Okay, now what do we need to do? 1 minute, some hidden things are there over here. How much is the number of equity shares? Number, value. Okay. Now, I don't know, one student asked this doubt too in recorded level. I don't know whether you also may face this. Sir. His doubt was, sir, this is amount column. No, this is amount column. So that means this 8 lakh is not the number of shares, sir. It is the value of the shares. No, people, when they say clearly number of equity shares, I mean this 8 lakh is not the value, it is the number only. Okay, na? Yes, sir. You got the doubt now. I put unnecessary ula. Okay. Yeah. So when they say, even if they say amount here, if they say number of equity shares, I mean this 8 lakh is the number of equity shares only and not the value. 8 lakh is the number. What is each share ka value? 10. That means what is equity share capital? 8 lakh shares of 10 each means equity share capital will be 80 lakh. That is one. Done now. I say it does this because they'll not have multiple amounts column. So they'll put in. Okay. But when they say clearly number, this is the number only. Now one more. Sir, can you find out debenture ka value? Is there any way? If interest amount is given, interest rate is given, is there any way to find out debenture value? How? Interest amount divided by expected interest rate. Here expectation and actual are same. How much? 12%. Interest amount 12 lakh divided by interest rate you do. How much are you getting? 1 crore is your debenture ka value. Done, Sarji. 100 lakh or 1 crore. Easy. These two are hidden adjustments which we need to keep in mind. Okay, next. Company is planning to start a new project with a capital outlay of 40 lakh. For this new project, how much money they require? 40 lakh. You are informed that debt equity ratio. How do you calculate this debt equity ratio they have told? Debt divided by debt plus equity. If you do that, and if this number crosses 35%, when you do debt divided by debt equity, debt plus equity, and if that number crosses, it is higher than 35%, then the cost of equity will become 12.5 and it will reduce P multiple to 8. Currently, what is P multiple? 10. If debt equity ratio crosses 35%, from 10, P multiple will become 8. And interest rate, currently what is the rate of interest we are giving on our debt? 12%. And the interest rate on additional amount borrowed will become 14%. So this new 40 lakh, whatever you're borrowing, if you borrow through debt, it will not be at 12%, it will be at 14%. All this will happen only if debt equity ratio crosses 35%. Otherwise, all the data what you have seen here will hold good, will remain same. Now we need to find out probable price of the share. Probable price of the share means they're asking MPS. If first case, two case, additional funds are raised as loan. How much money you want? 40 lakh. First case mein 40 lakh is coming through loan as in debt. Second case mein amount has come through equity shares. Read one more data. Bracket mein they've given retained earnings is how much? 1.2 crores. Okay, na sir? Clear? And this is what they've given. That means people, if I'll have to really break down the components of capital structure, break it down. How many components are there? 1 na, 2 na, 3 na? 3. Break down each. Equity share capital separately, retained earnings separately, debt separately, preference share separately. Like that, if I have to separate each component, there are one component here, 2 or 3. 1, 2, 3. Understood my question? Understood my question. Didn't understand. If you split the capital structure as equity share capital, retained earnings, debt, preference shares. Like now I called out how many? 4. Like this, if you split in this problem, how many are there? 1, 2, 3, 4. 1, 2, 3, 4. Which? 3. What are those? What dumb questions, sir. Here only you have written equity share capital, debt too. Also don't forget retained. Yes, sir ji. So can you tell me currently what is capital employed? Take your calculator and tell me. What is debt ka value? 1 crore. What is equity ka value? 80 lakh. What is retained earnings ka value? 1.2 crore. 1.2 crore is nothing but 120 lakh. So I added, how much are you going to get? 3 crore is my current capital employed. Do you agree? Because in FM mein capital employed means long term source of finance ka total. 3 crore pakka. How much EBIT you have generated? 52 lakh. The whole problem in this question is they asked MPS. But to calculate MPS, we need 2 data. What are those? EPS and PE multiple. At least PE multiple we know. Currently it is 10. If debt equity ratio crosses 35%, it will become 8. So PE multiple, no problem. What about EPS? To calculate EPS, what do we need? Now don't say this so. Sorry, EPS is given as 2.5. No. Now we are doing new project. No. When you do new project, you will get same EBIT or EBIT will increase. That means same EPS you will get or it will change. Now you tell me to get EPS. What is the formula for EPS? Each divided by total number of equity shares. Total number of equity shares I can find. That's not a problem. What about each? From EBIT you have to derive each. Correct? How? Reduce interest to blah blah. Yes. But how much EBIT you will get because of this new project? Given or missing out? When you're doing a new project, nobody will get 0 EBIT, correct? No. If you're doing new project means obviously we will get some EBIT. Maybe 1 lakh, 2 lakh, 5 lakh, 10 lakh. Given or missing out? Missing. So that means if new project ka EBIT is not given, then how do you find out total EPS? If you can't find out, how can you find out total MPS? Understood the pain point of this question, where we're getting stuck. Okay, that is the where we are currently stuck. Correct, Ji? Now, how to sort that? Very simple. You remember we used to calculate something called ROS, not your Valentine Days ka ROS. Here ROS means what? Return on capital employed. How we used to calculate return on capital employed, people? EBIT divided by capital employed into 100. Yes, sir. This is what we have to use here. Currently, what is my EBIT? 15. Currently, what is my capital employed? 3. That means what is my current ROS? 17 point some percentage. Now you tell me, people, if I'm currently, ROS ka full form is what you tell me? Return on capital employed. Meaning on how much ever capital. Sir, to do a project we need capital. So what is your return on capital here? You are getting 17.33. So if I raise any money, as capital, how much return I will expect from that capital? 17.33. Now I am raising how much capital more? If my existing return is 17.33% means for new project also, at least I will expect same return. Right? At least I will expect that much or more. Yes, ideally more. If not more, at least 17.33. Why 17.33? Because that is my existing project ka return. Yes, no. So here what is the assumption? New project also will generate a return of at least 7. That way you will be able to calculate new project ka EBIT. 40 lakh ka 17.33 if you do, you will get new project ka EBIT. Okay na Sirji? That is the first hidden adjustment of this question. For that, first we need to find out all the components of capital employed ka breakup. That's what I've done here. You got the thing, one hidden adjustment of this question. See here, that's what I've written here. Existing debenture value, they had not given. How did we find that? Interest amount divided by interest rate. We got that. And equity share capital they had given, retained earnings they have given. So what is the existing capital employed like you told? 3 crore. What is the EBIT? They had only told. Currently, what is our EBIT? 52 lakhs. So existing EBIT is 52 lakhs. Sir, how do you calculate rows now? What is our existing rows? EBIT divided by capital employed. 52 lakh divided by 300 lakh if you do, you will get an existing EBIT of 17.33. Till here, okay. Now, how much money we are raising extra for new project? 40 lakh. That means is our capital employed going to be 300 lakh or 340 lakh? From 300 lakh, it will increase by 40 and it will become 340 lakh. Correct? And how much return do I expect on my capital? 17.33. And how much is my total capital now? 340. So how much return will I expect? Whatever is my capital, on that I will expect a return of 17.33. Means what is my new EBIT? 340 lakh ka 17.33, which is 58 lakh 92. Easy na people? Yes. Previously, how much it was? Before new project, how much was my EBIT? 52 lakh. Now it has become what? From 52, it has become 58. That extra amount we have got it from new project. If you want also, you can also calculate that. How much is the new project ka amount to? 40 lakh. 40 lakh ka 17.33% you do. You will get some amount. 6 lakh and 3. To that you add existing EBIT 52 lakh. How much is that? Add 52 lakh to that number. 58 lakh 92 or 200. Like that also you can work out. Your call how you want to work it out. One way or the other. Done, people? Now you tell me, is this new project ka EBIT alone or existing plus new put together? This is existing plus new put together. Yes, sir. So one feeling, one thing what we need to sort out, we have sorted out. Next one is they told some drama. What is that? That drama was based on debt equity ratio. Can I go to that drama? Now what did they say in the problem? If debt equity ratio crosses 35%, then PE multiple will become 8 and new loan you have to borrow it at 14%. All this drama will happen only if debt equity ratio crosses 35%. And how do you calculate debt equity ratio? They only told debt divided by debt plus equity. Okay. Let's take up the first case. Sir, in first case, what is the assumption? Or what is the first case? Additional fund. Additional fund is 40 lakh. It is coming through loan. Loan as in debt. Currently, what is my debt value? 1 crore. How much more debt am I borrowing? 40 lakhs. So let's find out the debt equity ratio. See, I've written here. What is the total capital employed after the new project? Just now we wrote 340 lakh. What is the total debt? We already have 100 lakh. Now 40 lakh we have borrowed more means now the debt will become 140 lakh. So what is debt ka weightage? Basically they're saying debt ka weightage. Out of 340 lakh, 140 lakh is through debt. So calculate debt divided by debt plus equity. 140 lakh divided by 340 lakh, which is 41%. 41. Okay, no issues. Hit for 0.0% and all, let's not fight over it. What is the debt? Did it cross 35%? Did it cross 35%? Yes. Because the benchmark they told in the question was if debt divided by debt plus equity, if it crosses 35%, few things will happen. What are those? P multiple will not be 10, it will become 8. Now, existing interest rate was 12%. Now, can you borrow at 12% or 14%? This 14% is for the existing and new or only new? Additional they told. Other additional. Don't forget that keyword. Interest rate on additional amount borrowed will become 14%. Existing debt ka interest will still be 12. Whatever new debt you take, that interest rate will become 14. That's what we have summarized over here. This will happen in first case. Clear? Which case is this? When 40 lakh money is raised as a loan. Okay. Now what is the case 2? That 40 lakh you will take through debt or equity. So let's test it out. If the same 40 lakh is raised through equity shares, what will happen? Total capital employed still 340 lakh. What about debt now? Existing debt 100 lakh. That new 40 lakh came through debt or equity? That means debt is still how much? 100 lakh or 1 crore. Yes, sir. Calculate debt divided by debt plus equity. What is debt ka weightage now? Out of 340 lakh, now debt ka weightage is only 100 lakh. How much is this? 20. Did it cross 35%? If it does not cross 25%, P multiple will stay at 10. P multiple will stay at 10. That means what is the existing market price? 25. This will also be same. Existing market price. Why have I written this is? Now 40 lakh you are raising through how? Equity shares. Right? And what is the market value of one equity shares? 25. So how many equity shares you will have to issue? Totally 40 lakh you need through equity shares and the market value of one equity shares is 25. So how many extra equity shares you have to issue? 40 lakh divided by 25 which is 1,60,000. Currently we already have, I think, how many shares? 8 lakh shares. We already have 8 lakh shares. In second case, if 40 lakh is coming through equity shares means how much additional shares will be rolled out? 160. We need this for EPS calculation. Don't forget that. Done now. Once this is sorted, over. Till here if you have sorted means then remaining is just format. Okay people, what did they ask? MPS. To calculate MPS we need two data. What is that? P multiple, EPS. First that means you need to calculate EPS. For that we need EISH. EISH they have given or we have EBIT. So start with EBIT and first get EISH. And then calculate EPS. And then take P multiple and calculate MPS. That's the approach. Can we do it? Can we do it? What is the expected EBIT? 58 lakh 92 200. Sir, whether you take the money through equity shares or whether you money through debt, the new project ka EBIT will be same. How much? Because of this option, interest will change. EBIT will be same. Okay, no? Because this is earnings before interest and tax. Understood? No? Because of your financial plan, EBIT will not change. I used to give this example. Now, just because, now let's say, we are opening, let's say we opened a new branch in Hyderabad. We opened a new branch in Hyderabad. Now we put one big holding, big board. You know what board? For Hyderabad, to open branch, we needed 50 lakh. How much money we needed to open that branch? 50 lakh. In that banner, you know what we printed? 50 lakh is raised through debt. Please come. 50 lakh money we have raised through debt. Please come on one side of the board. Another banner may be printed. Okay, 50 lakh we have raised through equity shares. Please come. Students will come. Just because I have raised the money through debt, I will get 100 students. Or just because I have raised the money through equity shares, 100 students will come. That means what am I trying to say? How you raise the money has no impact on your EBIT. Right? Because of your plan, what will change? Because of your source of finance, interest will change. Interest will change. EBIT will be unaffected. Hence, whether you raise that 40 lakh through debt or equity shares, EBIT will be same for both the plans. Done na, sir? From EBIT, how do you get EISH? First, reduce interest. Here we have only one interest or two interest. One interest on the existing debt that they have only given. How much is the interest on existing debt? 12 lakh. Will this change or it will remain? It will remain. So, both the plan, this will be there. Now, what about new debt? Sir, first is a case where 40 lakh money is coming through debt. But did debt equity ratio cross 35%? Yes. That means on that 40 lakh, we will borrow it at 12% or 14%. 40 lakh or 14%. How much is that? 5,60,000. Here you are borrowing that extra money through equity shares. So interest on new debt will come or zero. By doing this, you will get earnings before tax, reduce tax, and you will get earnings after tax. Since there is no preference shares, earnings after tax and each will be same. Need a minute to review this. Okay. To calculate EPS, we need two data. Each and what is the other one? Number of equity shares. So we are here also we have two number of equity shares. What are those? Existing, new. What is the existing number of shares? 8 lakh. That will be same. New share. Sir, under if you raise the money 40 lakh through debt, new equity shares will come. No, that means here new equity shares will be 0. But if you raise the same money through new equity shares, how much extra shares will come? We already found out here in working note number 3. How much is that? 1,60,000. So that means what will be the total number of equity shares? 8 lakh plus 0, 8 lakh. 8 lakh plus 160, 960. Each divided by total number of equity shares. If you do, you will get EPS. Okay, now. They ask EPS or MPS. How do you get MPS? EPS multiplied by P multiple. But hang on. When you raise the money through debt equity ratio cross 35%. When debt equity ratio crosses 35%, will the P multiple be 10 or it will become 8? 8. And second case, did it cross? No. That means P multiple will be 10. So for first case, P multiple will be 8. Second case, P multiple will be 10. Okay, now. Multiply these two to get the MPS. That was the requirement of the question. A good question with few adjustments. Okay, sir. Just walk me through this question. What is the takeaway of this question? New project ka EBIT given or missing? Missing. Hence, we first find out ROEs. ROEs means return on capital employed. How do you get that? EBIT divided by capital employed. So whatever was our existing ROEs, at least we will expect the same ROEs from new project also. So that way we calculated the new EBIT. Old plus new project ka EBIT put together we got. Then they said some drama about we need a 40 lakh. We had two options to raise that money. Either go for 100% debt plan. First option. Second option, 100% equity option. But they told no matter what you do, if debt equity ratio, debt by debt plus equity, if that number crosses 35%, few things will change. PE multiple will become 8 and new loan will have to be taken at 14% borrowing rate. When we calculated under debt option, debt equity ratio became 41. Hence PE multiple will be 8, new borrowing will be 14%. But the same 40 lakh if you borrow through equity shares, did the debt equity ratio cross 35% or it was within 35? Since it was within 35, PE multiple will be same, 10. And current market price of the share unaffected. What is the current market price? 25. 40 lakh money we need and on one share we can issue it for 25 means how many shares, extra shares we need to roll out? 1,60,000. Rest everything, plug it into the format, normal format, you will get the EPS and MPS. That way, good question. Move on to the next, Sarji. Pakka. Still time is there, no? Not hungry, no? He's saying break. Hey, no, we'll finish. When we start the topic, no break. You can finish. If you want 2 minutes, yeah, I will chill. You drink here only. Or you want to go fill it out? Yeah, that's okay. That you don't have to ask. But long breaks, no. We'll finish the topic and then only break. Like that. One 115, 130 I'll give you, should be done. Okay. One or two more questions. Okay. Or at least I'll figure out. Okay, this one I'll do. Okay, people. This one, no. 115 to 130. Somewhere that we should be able to give you a break. Okay. If you want a break. If you don't want a break, we will do leverage and by 245, bye-bye. One of the two. Your call. That you tell me after this this one is over. You let me know. I'm comfortable either ways. And they're saying now only you leave, sir. Better. That is the best option. Can we review question number 18? This is a straightforward question. No? Nothing much over here. You remember financial break-even point and indifference point? Just a quick revision of this question. I'll read the data quickly. 5-10 minutes we'll run by. Ganapati Limited is considering 3 financial plan. How many options? 3. How much investment we want? 2 lakh. First option, no people. They're calling it as plan A. Second one is plan B. Third one is plan C. First plan, entire 2 lakh will come through equity. No debt, no preference shares. Second plan में 50% money through equity, 50% through debt. 2 lakh का 50%, how much? 1 lakh. Other 1 lakh will come through debt. So second is odd option, equity plus debt. Third one is equity plus preference shares. 50% money through equity, no debt, 50% through preference shares. Cost of debt 8%, preference shares 8%, tax rate 50%. Equity shares of face value 10 will be issued at a premium of 10. Face value is 10 and they'll be issued at a premium of 10 means what is the issue price? 10 plus 10 which is 20. EB80 given 80,000. Done. First they are asking very waste question. No? EPS. How do you find EPS? Sir? They have only given EB80. No? From EB80 first find ESH. It's very simple. No? You want me to run you through this question? Huh? EPS part, can you take care of it? I've solved it here. I'll just quickly show. We have one option or three options. First option is 100% equity. Second is 50% equity, 50% debt. Third is 50% equity, 50% preferences. Doesn't matter which plan you go for. Will EB80 change or same? Same. From EB80 go on reducing interest. Which option has an interest? First option has interest. First option is 100% equity. Third option is equity and preference shares. Only plan B has equity. Or plan B has debt. How much debt? 1 lakh. What is the interest rate? 8%. So go on reducing. But don't forget to reduce preference dividend. From earnings after tax, we have to reduce preference dividend. Only then you will get ESH. Okay, sir. But one thing, I just want you to tell me number of equity shares of each plan. Can you tell me that? Calculate that for me. How much is the number of equity shares here? Question we need, sir. Okay. Sir, face value 10, no? Issued at a premium of 10. Issued at a premium of 10. Face value is 10. Issued at a premium of 10. First option, what is the total number of equity shares? How much money we need from equity shares? 2 lakh. Okay. What is the issue price? 10 plus 10 which is 20. Totally we need 2 lakh. Each share ka price is 20. How many shares? 2 lakh divided by 20 which is 10,000 shares. Correct? In second option, 50% money will come through equity. Totally we need 2 lakh. Of that 50% means how much money will come through equity shares? 1 lakh. Each equity shares ka issue price is 20 rupees. 1 lakh by 20, how much is that? 5,000. Third option also same. 50% equity, 50% preference shares. So number of equity shares will be same. And that's your EPS. Okay, na sir? First requirement, very, very basic. Sir, I will use indifference point ka formula, sir. You can. There is another formula for indifference point EPS. What is that? EB80 minus I1 into 1 minus tax rate minus preference dividend divided by E1. If you don't want to do all this, you can solve like this also and get the answer which I've shown it to you. Your call. Absolutely no problem. How you want to present is your choice. And next, what is the second requirement? Financial break-even point. Now, I will show you the data. You will tell me the answer. Here, I'm showing you the data. Financial break-even point. First plan ka you tell me, sir. First plan is 100% equity. For a 100% equity plan, financial break-even point means EPS should become 0. When will EPS become 0? Only when EB80 is 0. Correct? So first answer is EB80 should be equal to 0. Second plan ka tell me. Second is equity and debt. If you have equity and debt, EB80 should be equal to interest charges. How much is interest charges? 8,000. Yes, sir. So first plan mein, what is the answer? EB80 should be equal to 0. Second plan mein EB80 should be equal to interest charges. Third plan mein it is 50% equity and 50% preference shares. What is financial break-even point for preference shares plan? Preference dividend. EB80 is equal to preference dividend? No. EB80 is equal to preference dividend divided by 1 minus tax rate. What is the preference dividend? 8,000. What is the tax rate? 50%. Solve this for me. Preference dividend is 8,000. Tax rate is 50%. Preference dividend divided by 1 minus tax rate. 16,000. Done now. Any problem? Usually financial break-even point, they will either ask as a 1 or 2 marks ka MCQ or club it with a bigger question. Separate question will not come. Done. Next, they ask indifference point. Or maybe I'll read the data for you. Indicate any plans dominate. Indicate any point, any plans dominate and compute the EB80 range among the plan of indifference. Maybe we didn't understand the question fully. No worries. At least they said plan of indifference. That means nothing but indifference point. We have 1 plans or 3 plans. Now people, indifference point means what? What should be the EB80 so that both the plans give you same EPS? Indifference point compares only 2 plans at a time. You can't compare 3 plans at a time. It's only 2 plans at a time. That means first you'll have to compare A with B. Then compare A with C. And then compare B with C. That means how many times we need to find out indifference point? Okay, now all will be same or different? Okay, you know how to calculate that? What is the formula for indifference point? EBIT minus I1 into 1 minus tax rate minus preference dividend divided by E1. Same thing will be equated with EBIT minus I2 into 1 minus tax rate minus preference dividend divided by E2. This we are doing comparison between A and B. Prabhu, don't take EBIT 80,000. This is project ka EBIT. This is project ka EBIT. Indifference point is a level. It's a benchmark. We need to find that. If you take 80,000, I will leave the class now only. Well, I will give break now only. This is a project ka EBIT. We have to find what is indifference point. That means when you substitute in this equation, is EBIT given or EBIT is pending? EBIT we don't know. That is what we are about to find out. Rest all the data you substitute. Like I1. In first plan, we are comparing A with B. In plan A, what is the interest? 0. So I1 is 0. Into 1 minus tax rate minus preference dividend. First plan is 100% equity. So preference dividend is 0. E1 means what? Number of equity shares. What is the number of equity shares in plan A? 10,000. So denominator is 10,000. Okay, na sirji. System is acting weird. This is the equation. Similarly, EBIT we don't know of second plan. That's what we are trying to find. Benchmark EBIT here. The rest all data you can take it from the previous table. Solve this equation. One quick way to solve is this 10,000 you can multiply to this. 5,000 you can multiply with this. That is one way. I don't like bigger numbers. What I will do is 10,000 divided by 5,000. 2. So directly 2. 10,000 divided by 5,000. How much? Directly 2. Now it's easy. Smaller number makes the calculations faster. This, but anyway, how to calculate is your call. So when you calculate, how much did you get? 16. That means what? The level benchmark for what? A and B. For benchmark for A and B is 16,000. 16,000. Got it? Everybody good? If project ka EBIT is exactly equal to 16,000. If project ka EBIT is exactly equal to 16,000, then either you can select plan A or you can select plan B. You will get the same EPS. Okay, now if you want, I think I've proved it also over here, but any which way, I think now time is not there. Leave. That's okay. Fine. Now we'll agree with the theory there. Done. Now what was one more theory, people? Like this. Now we have. Now we did a comparison between what and what? A and B. Next will be with B and C. Next will be with A and C. Okay. Now 1 minute, hang on. If you read the question, they asked, any plans dominate? Any plan dominate? Now people just observe. On debt, how much interest rate are you giving? 8%. On preference shares also, how much dividend are you giving? 8,000. Correct? Correct. Now, everybody, if you just observe, first, debt is there in which plan? Plan B. Preference shares is there in which plan? C. Now, when you calculate indifference point between B and C, when you calculate indifference point between B and C, what will happen is, check, I'll show you instead of telling. You will not be able to find out EBIT between B and C. Why? Sir, when you solve this equation, you will get this. You will get this on the left LHS, you will get this on the RHS, left hand side, right hand side. This point for EBIT, this point for EBIT will get nullified. That means you will get negative 4,000 is equal to negative 8,000. EBIT you are getting, it is getting nullified. That's what they said. Sir, if you are not able to find out EBIT, that means one plan is dominating the other. Because indifference point means what, sir? Both are same. So there is not domination or no domination? No domination. But if you are not able to find out indifference point means, that means one is dominating the other. Which is that? You tell me, you know this. Sir, debt will dominate preference shares plan. No. Why? Though in this problem, interest you are paying at 8%, preference dividend you are paying at 8%, on debt you will get an extra advantage, which is what? Tax benefit. On preference shares plan, you don't get the tax benefit. That is the reason you are not be able to find an indifference point between these two plans. That is what you need to write. Debt plan will dominate preference shares plan because debt will get an extra benefit called tax benefit. Therefore, plan B will dominate plan C. You will not be able to solve. Just leave it here and write these comments. That is what they asked. Clear? Goindana Guruve, got it a Guruve. Got it. Take much, huh? Mine, cheers. Over, and now, people, let's just for your assumption, just for your simplicity, 5 minutes, I'll quickly prove this. Sir, what was the indifference point between A and B? For A and B, when we solved indifference point, how much did we get? 16,000. So once again, theory, if project ka EBIT is exactly equal to 16,000, then either you can select A or you can select B. It will not make any difference. Both the plan ka EPS will be same. Because at indifference point, you can select any, both will give same EPS. Tell me two other scenarios here. If you are below indifference point, you'll select that plan which uses higher equity because that will give you higher EPS. If you are above indifference point, then you'll select that plan with a higher debt because that will give you higher EPS. Can we prove that? I proved it. Can I show it to you? Now, I'll not ask you. Last time I asked it in the batch show. They gave weird numbers. So here I only take. What is indifference point ka EBIT, people? Between A and B, 16,000. I've just noted it down here. IP as an indifference point. What is indifference point EBIT? 16,000. Now let's assume first case where actual EBIT, actual project ka EBIT is lower. It is not 16, it is lower. That means we are at above indifference point or below. So actual EBIT, let's say project ka EBIT is 10,000. Okay, na sir? And now, stop. Which plan are we comparing? A and B. A is what sort of a plan? 100% equity. Plan B is 50% equity, 50% debt. As per theory, which one should you select? As per theory, if you are below indifference point, if actual project ka EBIT is lower than indifference point EBIT, you will select that plan which is using higher equity. Here 100% equity, here 50% equity. Which is using higher equity? Plan A. Now calculate if you want. Now what is the EPS? How much is the actual EBIT I have assumed? 10,000. Now calculate EPS. Now I don't want to start with from the beginning. We'll use indifference point ka EPS formula. What is EPS formula? This. What is the actual project ka EBIT I have taken? 10,000. First plan is 100% equity. Will it have any interest? No. Into 1 minus tax rate. There is no preference dividend. How much is the number of equity shares? 10,000. How much EPS you got? 0.5. Any problem? Calculate for plan C. Same plan C. Plan B you calculate. How much is EBIT? How much is EBIT? Project ka EBIT is 10,000. Minus I1. Plan B has a debt. Yeah. Plan B has how much debt? 50% debt. How much is the value of debt? 1 lakh. And interest rate is 8%. That means interest rate is how much? 8,000. You calculate this for me. Let's see. Interest is 8,000. I'm only telling here. EBIT is 10,000. Okay. 10,000 minus interest is 8,000. Into 1 minus tax rate. Minus preference dividend not there. Number of equity shares is 5,000. Yes, no, G? Correct, no, G? Following, no? Or am I speaking to myself? No. How much did you get? 0.2. What is this? EPS. What did the theory say? If you are below indifference point. If you are below indifference point, select that plan which uses higher equity. Now, indifference point EBIT was 16. Actual project ka EBIT, I assumed it to be only 10. So, you are below. So, as per theory, you have to select plan A because it is having higher equity. What did you get EPS of plan A? 0.5. Plan B ka 0.2, which is giving higher EPS. Plan A. So, theory is working out. Sometimes they also ask you to prove this by assuming various numbers. You can assume 15, no, 14, no, 10, no, 3,000. Any number you can assume and prove this. Such question also we have done in regular class. Just saying. Done now. Now, what do you think will be the next scenario? Now, this is below indifference point. Next will be higher. Now, give me one number above. Time. We have to solve the whole thing again. We'll take this only. What is indifference point EBIT between A and B? 16. Now, I'll take one number above 16. I've assumed it to be how much? If actual project ka EBIT is 20, what will happen? Now substitute. Instead of 10, now I'm taking it as 20. Rest all digits same. 20,000. Interest is not there in plan 1 into 1 minus tax rate. Preference dividend not there. Divided by number of equity shares. How much are you getting? 1. Same thing, calculate EPS for plan B. EBIT is 20,000. Interest is 8,000 into 1 minus tax rate. Preference dividend is not there. Number of equity shares is 5,000. How much are you getting? 1.2. 1 minute. Go back to theory. Now you are below indifference point or above. When you are above indifference point, you will select that plan which uses higher debt because that will lead to higher EPS. Now, this has 0% debt, this has 50% debt. Which is using more debt? Plan B. I mean, above indifference point, theory says you should select plan B because it gives higher EPS. Practically, did it work out up? See, plan A ka EPS was 1, plan B ka EPS was 1.2. So, obviously, you will have to select plan B. Goinda, got it. This is just a proving. You prove this in exam only if they've asked. Sometimes they do. We have 2 questions in our regular study material also, our class notes also. Check and do it. Otherwise, this is not required. And is it necessary to assume same number what I've assumed? No, you can take any number above indifference point, any number below. Take a little. If this is 16,000, don't take 16,100. Then you will get a close enough decimal. So then you will only freak out. So let there be some difference of 5 to 10,000. So it becomes easy for you to analyze. If this is 10, maybe take the other number as 18, 20,000 like that. First, just for easy purpose. Okay, sir. This is also done. No, done. Okay, this one question I will tell you. One small concept is there. Because of that, I've taken this question. I'll read the question once for you. Arbitrage is still there. Chillo. Company needs 42 lakh rupees, 42 lakh 50,000 for new plant, new project. 3 plans are feasible. So 3 options. This 42 lakh 50,000 company may issue. First option what? 4 lakh 25,000 equity shares of 10 each. How much money? 42 lakh 50,000. So first plan is 100% equity. Second plan made 2 lakh 12,500 equity shares of 10 each and 21,250 debentures of 100 each. I mean, second plan is of 50% equity, 50% debt. Third, 2,12,500 equity shares of 10 each and 21,250, more importantly, cumulative preference shares. That's a crux. So, third option is what? 50% equity, 50% preference shares. Luckily, Prabhu, they have only given EBIT. For how many years? 75, 1, 2, 3, 4, 5. Okay, na sir. 5 years. EBIT is changing each year. That means we can have 1 column or 5 columns. 5 columns. Done now. Because they have only told each year ka EBIT is changing. You need to find out EPS. Faltu no. EBIT they have only given. They are asking EPS. How do you, to find EPS we need 2 numbers. What are those? Issue, number of equity shares. And they have given EBIT. Check, I've solved here. Take, or maybe I've assumed this all this as different cases. Whatever, it's fine. No? Now, this is your EBIT given. From EBIT, reduce what? Reduce interest. Now, people, how many plans are there? 1 or 2 or 3? No? 1 plan or 3 plans? First plan is what? 100% equity. I'm not doing that. Second plan, 50% equity, 50% debt. I'm not doing that. Same. Nothing new there. Third plan, I have solved it and put it up here because there's a small concept. I'm not solving this question. One concept is there. I just want to put it across to you. That was the intention of this question. So third plan, what is the third plan, people? 50% equity, 50% preference shares. And each year ka EPS same or different? Different. I've copy pasted this. This is your EBIT given. What sort of a plan is this again? 50% equity, 50% preference shares. So interest is there? No. You get PBT. From PBT, if you reduce tax, you will get PAT. Correct? For EPS calculation, we need PAT or EASH. How do you get EASH? Reduce preference dividend. Reduce preference dividend. 1 minute, everybody. Check the screen. How many preference shares are you issuing? 21,250. Each ka face value how much? 100. So what is the preference share capital? 21 lakh 25,000. Correct. So this is your preference share capital is 21 lakh 25,000. What is your preference dividend? Can you tell me that? What percentage preference shares are these? 8%. So basically preference dividend will be 21,25,000 ka 8%. How much, Guru? 1 lakh? 1,70,000. Any problem? 1,70,000. Now check the number. How much did you get it as profit after tax? PAT is how much? 45. But how much is the preference dividend you told? 1,70,000. Sir, PAT available is only 45. Preference dividend is 170. So one student will ask doubt. Sir, dividend we pay only when there is profit. No. Dividend we pay only when we pay profit. When we have sufficient profit. Here we have sufficient profit or shortage. Our Prabhu will write 45 and take 8 to be 0 and do it. You're right. Your thinking is right. That would be so when it is non-cumulative preference shares. When it is non-cumulative means what? Dividend will go on accumulating. That means can you escape? Meaning actually practically what happens is if you suffer a loss, if it is cumulative preference shares and if you suffer a loss, in the year of loss, company will not pay dividend. But in the next year when company makes profit, next year ka dividend as well as last year ka arrears of dividend, both will be settled. Yes, that means can you escape dividend payment in case of cumulative preference shares or you cannot escape? You can maybe escape this year, but in future years may you have to pay. Whatever dividend you did not pay previously, you also have to clear that dues also. Correct? Now, we are not doing accounting. We are doing analysis. Subject is not financial accounting. It's financial management. So, from our decision making is concerned, can you escape preference dividend ka payment or you cannot? That means don't write 45 or don't write 0. What is the preference dividend amount? 170. Take that as it is. Okay, people. That means your each will be positive or negative. Negative. No problem. Sir, EPS it is. What is it? EPS. We have done an accounting standard 20 in case you remember. Or leave that. I'll not go there. Now, EPS. EPS is what? Earnings per share. They did not say profit per share. It is earnings per share. Earnings can be profit. Earnings can be loss also. It doesn't matter. If you get each negative, your EPS also will be negative. Go ahead and calculate. EPS can also be negative. Absolutely no problem because it is earnings. Earnings can be positive or earnings can be negative. Earnings can be profit or earnings can be loss. Doesn't matter. But deduct full preference dividend in all the case. That too was the small concept in this problem. That's all. First two case mein this drama is not there. It is very simple. Only in this case mein, this is one concept I wanted to put it across. Rota, final, pakadana. And now an arbitrage quickly we will review. Correct. See, they are also explaining now. All election wala drama, I think, no? All of you have the vote. All of you have voting eligibility, huh? So obviously goes without saying you will vote. Awesome. Now 1 minute. Arbitrage. Sir, there are 4 cases of arbitrage. I'll explain one as one problem and remaining I'll just quickly tell you what needs to be done. Now, first of all, you tell me what is arbitrage or when will arbitrage come? First of all, arbitrage is as per whose model? You're keeping what as a base? approach. As per approach, if there is no tax rate, levered firm ka, unlevered firm ka, both ka value should be same. If it is not same, then only you can do something called arbitrage. And this arbitrage is an activity not done by the company, but by the investor. Okay, sir? Alright, how to do it? Very simple. First, I will go through the question with you now. One question we will take. There are 2 companies, N and M. Keep your calculator, nothing to write down anything. Just observe, that's it. 2 companies, M and N. They are having same EBIT. How much is that? 20,000. Both the firms ka EBIT same. M is a levered company having a debt of 1 lakh. At what interest rate? 7%. Cost of equity of N is 10, M is 11.5. Cost of equity given. Now people, arbitrage only works when value of both the firms is not equal. Yes, no? So first let's confirm that. So first step in arbitrage problem is to find out market value of both the firms. Here one is a levered and one is a unlevered. What is levered? M because they are using debt. So that means N becomes your unlevered. Find out the market value of the firm. How do you find out market value of the firm? EBIT by KO. Have they given KO or have they given cost of equity? Cost of equity. Yes, sir. That means you can find out KO directly? No. There is another formula to find out value of the firm. What is that? S plus D. Do you know the value of debt? Yeah, how much? 1 lakh. That means you just need to find out S. And how do you get S? Net income divided by cost of equity. Sir, net income is nothing but Ish, no? They have given EBIT. From EBIT, can't you find out Ish? Yeah. Cost of equity, they have only given. That means first work out what? S. So check what I've done here. Started with EBIT. How much is EBIT for both the firm? 20,000. M is a levered. How much debt are they taking? 1 lakh. At what rate? 7%. M has an interest rate of 7,000. N is unlevered. So interest will be 0. So you will get earnings before tax. So this whole concept of arbitrage works when there is no tax rate, where the value is same. So your earnings before tax, earnings after tax and net income all are same. How much is that? 13,000. Till here, anybody, any doubt? No? Paka? Yes. Now to find out S, we need one more component, which is what? Cost of equity. Is cost of equity missing or given? How much was that? For careful, for M it is 11.5, N it is 10. First we wrote M, no? For M it is 11.5%, N it is 10%. So these two if you divide, what are you going to get? 13,000 divided by cost of equity if you do, you will get S. What is S? 113043. These two ka division will give you 2 lakh. Done now. But we need S or we need market value of the firm. How do you get that? S plus D. Levered firm is using how much debt? 1. Debt usually book value, market value will be same. If they don't say, because debts are usually not traded. Even if it trades close to the book value. Hence the conventional assumption is book value and market value both are same. For what? Debt. What is book value? 1 lakh. So market value also will be 1 lakh. This firm is an unlevered firm, so their debt will be 0. Now you got the value of the firm. Okay, na sir? There, keep in mind there is no tax rate. There is no tax rate. This is levered firm, this is unlevered firm. If there is no tax rate, both this firm ka value should be same. Is it same? No. Now only you can think about doing something called arbitrage. This is the first step in arbitrage, finding the value of the firm. Easy. Everybody good? Arbitrage company does or investor does? Investor does. Now check here. Compute how the arbitrage works. Assume investor owns 10% shares in the levered company. Currently investor is holding shares in which company? Levered company. Sir, arbitrage is a very simple process. What it is whichever firm ka shares is overvalued, whichever company ka shares are overvalued, sell it and buy whichever company ka shares which is undervalued. Once again, what is it? Whichever firm's ka shares is overvalued, sell it and buy that shares which is undervalued. Now check here, which firm ka value is overvalued? First is what now? M. M is overvalued because its value is more and N is undervalued. Now people, you tell me what will happen, or arbitrage ka if you want one more synopsis. Now, or tell me what will happen here as an arbitrage process. This particular M limited ka shares people will sell and buy what company ka shares? N. Agreed? Why? Whichever firm is overvalued you will sell and whichever firm is undervalued you will buy. That's a simple shifting process in arbitrage. Yes. Now think, it's a simple economics concept. If more and more people sell M ka shares, what will happen? If the demand, if the supply is more than demand, what will happen? Price will fall. So if more and more people start selling M ka shares, means M ka value will go on reducing. Whose firm ka shares they are buying? N ka. So if more and more people buy N ka shares, N ka value will increase. At some point of time, both their value will become same. Till that time, you can do arbitrage. Till that time, this value becomes same. You will go on doing the arbitrage. Who? Company or investors? Yes, that's the meaning. Not required for your exam, just for your knowledge sake. Clear? Done. Now, you tell me again, investor is currently holding shares in which company? Levered firm, which is M. How much percentage? 10%. Keep your calculator. Everybody. An investor is holding shares in which firm? M company, levered firm. Okay. And now he wants to sell it. Now you will sell it at book value or market value? What you will sell? Equity shares. This is equity shares ka market value or firm ka? What is equity shares ka market value? 113043. This 113043 is market value of one share or 100%? 100%. Investor is owning 100% or 10%? So calculate. That means by selling, investors will get how much money? 113043 ka 10%. That is your market value of this. By selling the share, investor will get how much money? 11,304. Clear? Done, people? And now arbitrage, you can do in two approaches. One is surplus cash approach. Another one is surplus earnings approach. Surplus cash, surplus earnings. So here first I'm showing you surplus cash approach. Okay. In surplus cash approach, what it works is, first, can you tell me what currently investors are a shareholder in which firm? M Limited. Can you tell me this shareholders ka return? This shareholder ka return. Shareholders will get share in EBIT or EASH? EASH. What is the EASH of the levered firm? 13,000. Right? An investor is owning 100% or 10%. So what is existing return? Remember the first problem we did 2,800 ka 2% something? Same. EASH here is 13,000. Investor is owning 10%. What is existing return? 13,000 into 10%, which is 1,300. That is the next step. First step, again, walk me through what is that? Finding out market value of both the firms. Second step, it's not mandatory to present in this firms only, okay? But all the four problems I have presented in this firm so that it becomes a template of format for you. Becomes easy to solve, okay? So first step is to find out market value of the firm. Which firms? Both the firms. Second, by selling the shares, how much money you will get? That's the second step. Third one, you find out the existing return. How do you find existing return? Take the EASH and multiply shareholding percentage. Okay, sir. Comfortable? Now in surplus, with this which arbitrage are we doing? Surplus which approach? Cash approach. In surplus cash approach, if your existing return is 1,300, listen to this carefully. If your existing return is 1,300, when you shift over to which firm? Now we are going from levered to unlevered firm. Even when you shift from levered to unlevered firm, your return should still be how much? 1,300. There will not be any change in your earnings. Because you are not using surplus earnings approach, you are doing what approach? Surplus cash approach. That means if your existing return is 1,300, even after shifting, your return should be 1,300 only. That's your checkpoint. If you don't get it, you have done something wrong. There only you have the answer. Fine. I'll prove it to you. Anyway, we can review that. Done. Now people, in arbitrage process, you're doing arbitrage to get some gain. But risk level should not change. Risk level should not change. Now everybody observe, investor is a shareholder in which company? M Limited. M is a levered firm. Levered firm means it has a debt. A firm using debt only we call it as levered firm. Now careful. Levered firm is using debt means levered firm has an element of risk. What risk? Debt risk. And currently we are an equity shareholder in the levered firm. That means we are also exposed to debt risk. Do you agree with me? If a company is exposed to debt risk means since we are the investor in the company, we as an investor also are exposed to debt risk. Agreed? Yes. Yeah. How much debt levered firm has taken? 1 lakh. Right? Will I be, as an investor, will I be exposed to 100% of the debt risk or my shareholding percentage? M Limited has a total debt of 1 lakh, but my exposure to debt risk is 1 lakh or my share percentage? How much is that? 10,000. Correct? Now that means I have a debt risk to the extent of 10,000. Do you agree? Now I am selling M ka share and buying which company ka? N. N is unlevered firm. Unlevered firm means they have debt or no debt? Means risk reduced. Risk reduced. In arbitrage process, risk level should be reduced or risk should be maintained. Risk should be maintained. But this firm does not have any debt. Here M Limited, since they had a debt, as an investor, I had one risk on my head. What risk I had on my head? Debt risk. Debt risk. Now I have when I shift over to N Limited, I have debt risk on my head or no debt risk? Can I change the risk or I should maintain? Hence, to maintain the risk, what investor will do here is borrow. What investor will do is borrow. Take a loan. How much? 1 lakh. Here investor had 1 lakh ka debt risk or shareholding percentage. 1 lakh ka 10%. How much is that? 10,000. That means here investor will borrow how much amount? 10,000 rupees. Why do we do this borrowing? Because the moment you borrow, investor is taking a debt. That means investor will have a debt risk. Earlier also investor had a debt risk. Now also investor has a debt risk. Because risk should not be changed due to arbitrage process. Done now, people? Once again, walk me through. This is the most important step. Walk me through this process. What is this? Currently, investor was a shareholder in which company? M Limited. M is a levered firm. Levered firm means it has debt. And I was an investor in this firm means as an investor, I also had a debt risk. How much debt firm had? 1 lakh. That means I will be exposed to 1 lakh ka debt risk or my shareholding percentage. What was my shareholding percentage? 10%. So what is 1 lakh ka 10%? 10. So before this, I had a debt risk of 10,000. Now can I reduce this risk or maintain? How do I maintain this? By taking a borrowing. How much amount? 10,000. Clear, sir? Any problem, sir? No. Now people, investor totally has how much money? Can you tell me? Investor totally has how much money? Investor borrowed how much? 10,000. He also sold M Limited ka share for how much value? 11,304. By selling levered firm ka shares, investor recovers 11,304. By taking a loan, how much investor got? 10,000. So total cash available how much? That is the cash available for investment. Agreed? Any problem? No. Now we'll use this money for what, Joy? To buy the shares of the other firm. What is the other firm? N Limited. Yes. Now 1 second, hang on. Surplus earnings approach or surplus cash approach? Surplus cash approach. In surplus cash approach, what will happen is, how much is investor holding previously? 10%. In which firm? M Limited. Now also investor will hold how much? 10%. But of N Limited. That means shareholding percentage in surplus cash approach will change or it will not change. If investor was holding 10% here means now also he will continue to hold how much? 10%. Correct? So investor will buy how much percentage equity shares in N Limited now? 10%. Okay. Now people, what is the market value of equity of the unlevered firm is 2 lakh. This 2 lakh is for 1%, 10% or the whole company? Whole company means it is for 100%. Is investor buying 100% equity or 10%? So how much money we need? To buy 100% we need 2 lakh. For 10% how much we need? 2 lakh ka 10%. How much is that? 20,000. Oh, happy news. Why? Sir, investor has how much cash? 21,304. But cash needed for investment is only 20,000. That means, is investor utilizing the entire cash or some extra cash is still pending? How much is that extra cash pending? Camera. I thought I'll capture you beautiful people. Where it went? Here. Now, how much cash investor is still left with? 1,304. How? 21,304 is available, but utilized is only 20. How much is pending? 130. This is the gain investor got. Through what process? Arbitrage process. Now, investor can do whatever the hell he wants with this extra cash. Throw it, tear it, use it, whatever. That is your surplus cash approach ka arbitrage. Understood? Yes. Now, one more checkpoint should be satisfied. What is that? In surplus cash approach, if your existing return is 1,300, after shifting over to the other firm, also your return should be 1,300. If it changes, you have done arbitrage process, something wrong. Can we test? Now investor has shifted from what firm to what firm? M to N. M to N. Shareholding percentage changed? Same. What is the return for equity shareholder? EBIT or based on EASH? Now shareholder is shareholder in M, N. N. What is N ka EASH? 20,000. How much percentage shareholder investor owns? 10%. So what is the return? 2,000. Ayyo, wrong no. You told some value wrong. Don't do like this. Marathon, no camera and all is recording. What are you doing? 20,000 into 10%. What is the return? 2,000. Correct? No. Sir, how much was our existing return? 1,300. And it became 2,000. I mean, somewhere we have done wrong. Not wrong. Correct only. Return, how much did you get? 2,000. But in order to do this arbitrage process, investor also took a borrowing. On borrowing, if you take a borrowing, you will receive interest or pay interest. Interest is at what rate? 7%. How much loan investor took? 10,000. How much interest investor has to pay? 7%. So how much interest will go off? 700. Return is 2,000. Interest payment is 700. Net number is how much? One is a benefit, another one is a cost. So net benefit how much? 1,300. Earlier how much it was? Changed as same. That means arbitrage process done and dusted. Okay, na sir. This is what approach? Surplus cash approach. See, I have written the synopsis over here. First case, you are shifting from levered to unlevered firm. Which case mein? Surplus cash approach. In surplus cash approach mein, shareholding percentage will change or same? Earlier, if you are holding 10% means now also 10%. Will return change or same return? Same return. Okay, na sir. Now next case, same. You are going from, or 1 minute. I'll give you some 1 or 2 minutes to process this. Observe. Many people skip arbitrage. It comes, people. Okay, it's also one of the important concepts. Can we give a quick walkthrough of this? Again, run through. What is the first step? Tell me in steps now. Let's see if we can recollect. Arbitrage process, when will it come first of all? If there is no tax rate. If there is no tax rate, levered and unlevered firm ka value should be same. If it is not same, then only you can do something called arbitrage. That is the first step. Arbitrage ka simple process is whichever firm is overvalued, sell it. And whichever firm is undervalued, buy it. Okay, first step in arbitrage process is to find out whether both the firms ka value is same or not same. Hence, first you need to find out V as in value of the firm. Two firms, levered and unlevered firm. First step, clear? Second, now investor will sell the shares. Investors will sell the shares at book value or market value. So take the market. Here we are going from what? We are shifting to what? Levered to unlevered. What is market value of the levered firm ka shares? 1,13,043. This is for 100%. Will investor own 100% or 10%? So by selling the shares, how much money investor will recover? 10%, 11,304. And through this, since it's surplus cash approach, return should change or same return? Same return. So first find out what is the existing return. For an investor, how do you calculate existing return? Based on EBIT or EISH? So if you want it as formula, what will be? EISH multiplied by shareholding percentage. Currently a shareholder is in M Limited. What is M Limited ka EISH? 13,000. What percentage shares are we owning? 10%. So 13,000 ka 10%. How much? 1,300. This is our existing return. Even after arbitrage, the number should be same. Now, currently we are a shareholder in which company? Levered firm. Levered firm has a debt. If levered firm has a debt, as an investor, we also have a debt risk on our head. How much debt levered firm has? 1 lakh. Full 1 lakh we have debt risk or our shareholding percentage. So how much is that? 10,000. Yes. So due to arbitrage process, risk level can you change or keep it? Keep it same. But how do you keep it same? Because unlevered firm does not have debt. So what to do? Borrow. How much money? 10,000. That you will borrow. That means you will get two sources of finance here. You will get cash from two sources. What is that? One borrowing, another by selling levered firm ka shares. Both if you add, you will get the total amount available for investment. How much is that? 21,304. But in the surplus cash approach, will the shareholding percentage change? No. Here you are holding 10% means here in this firm also you will still hold 10%. Okay. But to buy 10% in unlevered firm, how much money you need? What is the market value of equity in the unlevered firm? 2 lakh. Are you buying 100% or 10%? That means how much money you need? 2 lakh ka 10%. How much is that? 20,000. You need 20, but you have how much? 21,304. So how much money you are still left with? 1,304. That is a gain due to arbitrage. 1,304. Okay. But earnings should change or same? Same. How do you find out earnings for equity shareholder now? Now we are a shareholder in N Limited. How do you find earnings? Based on EBIT or EISH? EISH. What is the EISH for N Limited? 20,000. This 20,000 is for 100%. We own 100% or 10%. So what is our return? 2,000. This is one return. But we also borrowed. How much money we borrowed? 10,000. On this borrowing, since we have taken a loan, we need to pay interest. At what rate? 7%. So 10,000 ka 7% interest is a payment. This is a return, this is a cost. So what is the net return? 1,300. So earlier also it was 1300. Now also it is 1300. So any change in return or zero? That's all. That's your arbitrage process done through which angle? Surplus cash approach. Now the same scenario, if you have understood this, same scenario, we are going from levered to unlevered firm, not under surplus cash approach, but under surplus earnings approach. Surplus earn. Sir, in surplus earning approach means if you are already getting 1300, we will expect 1300 or more. That's the second approach. If you want to get more means, will you buy same 10% or you will buy whatever amount? So if you are doing here, if you're going from levered to unlevered firm under surplus return or surplus earnings approach, simple thing is how much money is available for investment now? 21,300. This, any part of this money you will keep it or you will invest this fully? Invest this fully. Invest the entire amount available. That's what I've written over here. So in this problem, what was the amount available? 21,304. Entire 21,304 you will invest. Clear, sir? That's the only thing. That means your shareholding percentage will be same or change? Change. How much? Sir, to buy 100% of N Limited, how much money you need? 2 lakh. Are you investing 2 lakh or 21,304? So with the 21,304, how much shares can you buy? To buy 100%, we need 2 lakh. It's like this Dabba approach. If you want to buy 100%, you need how much money? 2 lakh. But are you investing 2 lakh or 21,304? With 21,304, how much is the shareholding percentage? Calculate. So basically 21,304 divided by 2 lakh into 100, how much? 10.65%. Earlier you were holding only 10. Now we are holding 10.65. So if you are owning more means your earnings will be same or earnings will be more. Again calculate the earnings. Earnings in the old firm or new firm? New firm. But new firm ka earning will be same. Existing firm ka earning is 1,300 means new firm ka earnings will not be 1,300. It will be more. That's your checkpoint. If you get more, you have done. You have done right. Otherwise, something wrong. That's all is levered to unlevered firm under which approach? Surplus earnings approach or surplus return approach. Clear, sir? This is movement from what to what? Levered to unlevered. Now, what do you think in the next case will be? Unlevered firm to levered firm under first surplus cash approach. Fourth case will be unlevered to levered firm under surplus earnings. Clear? Now, tell me this, from what to what you are moving? Unlevered firm ka shares you are selling, levered firm ka shares you are buying. First step same, second step same, third step same. What is first step? Finding value of both the firms, same. Whichever is the case, first step, every case same. Second, you are selling, you are selling means you will sell it at book value or market value. So find out by selling how much money investors will get. Second step. Third one, find out existing return. Now you are a shareholder in which firm? Unlevered firm. Find out the existing return in unlevered firm. Done now, people. Now 1 minute, hang on. You are a shareholder in which firm? Unlevered firm. Unlevered firm means debt is there or debt is not there. That means as an investor, you have debt risk here or don't have. But now you are shifting to levered firm. Levered firm has a debt. That means one extra risk came called debt. Risk level should change. Risk level should be same. Earlier we did not have debt exposure. Now we are exposed to debt. That means now we are getting extra risk. In arbitrage process, risk level should be changed or maintained. Maintained. Now we can't tell the levered firm as an investor, you repay your debt. I don't want that risk. You can't do that because you are a small chintu pintu investor. So now you can't dictate terms, correct? But we can't change the risk also. Now you will borrow. You will borrow. Hey, you already did not have debt risk. Okay, you don't have debt risk. So is borrowing required or not required? Not required. But since you are exposed to debt risk, what we will do here is you will have money to invest. No, you will have money to invest. Don't buy just the equity shares of the levered firm. Also invest in debt to cover that risk. Because when you invest in debt, you get a fixed return. You get a fixed return. On equity, you don't get fixed return. So that way, the risk level will get balanced. Understood? Once more, Govinda. What does it tell me? Use this. Tell. If you're going from unlevered firm to levered firm, under which approach? Surplus cash approach. What are we doing here? In unlevered firm, we did not have debt risk. But since we shifted to levered firm, we are now exposed to debt risk. But risk level should not change. Hence, what do? Whatever amount you have to invest, right? You use that money not only to buy equity shares of the levered firm, but also to buy the debt. How much debt? Very simple. What is your shareholding percentage? 10%. So invest in that shareholding percentage. Suppose levered firm has 1 lakh debt. Levered firm has 1 lakh debt. You will buy full 1 lakh or your shares? Your shareholding percentage, 1 lakh or 10%. Got it? But do keep in mind, this is still which approach? Surplus cash. So that means you will invest some portion of your money in equity, some portion of the money in debt. But will your equity ka shareholding percentage change or same? Because which approach? Surplus cash approach. That means your return should change or no change in return? No change in return. When you compare amount available for investment with amount invested, you will have some balancing figure. That balancing figure only is your surplus cash. Same drama, but the only step is you will not invest just in equity shares, but you will also invest in debt. How much debt? Your shareholding percentage. Take the debt of the levered firm and multiply your shareholding percentage. That much you will invest in debt. Correct, people? Got this? If you have got this, tell me the next approach. What is the next approach? Unlevered firm to levered firm. Which approach? Surplus earnings approach. First step, same. What is first step? Value of both the firm, same. Second step. By selling the shares in unlevered firm, how much money you're going to get? Second step. Third one, existing return. Same. Fourth one, investment. Now again tell me, we are a shareholder in which firm? Unlevered firm. We have debt risk or no debt risk? Now we are shifting to which firm? Levered firm. But levered firm has debt. That means we automatically got exposed to debt risk. How do we cover? Invest in only equity or also debt? But hang on, surplus earnings approach. That means we want to earn same or earn more. If you want to earn more means, will we keep any cash idle or invest fully? Invest fully in both equity and debt. In what ratio? Debt equity ratio. In debt equity ratio. And usually this debt equity ratio will be 1:1. Most of the problem here, they will keep it same. That means equal amount you will invest in debt also, equal amount you will invest in equity also. That means since it's a surplus earnings approach, you are buying same 10% equity shares or you don't mind buying more. In fact, you want to buy more. Correct? No, that means your shareholding percentage will be same or it will change. Change. Your earnings will be same or earnings also will increase. Earnings will increase. If you compare existing earnings with new earnings will be more. That only becomes your arbitrage ka gain. Okay, people? Keep this pointers as a base and try to solve those questions because I don't have time to cover all the 4 questions. That will be taking another 45 minutes to 1 hour. So, quite difficult in the interest of time. But I hope this is okay with you. We have done it in regular class, by the way. Don't spread rumors. He missed it. Regular class, we have done. Here, it's difficult. Photo, take macha. Cheers. Which one you want? You want me to zoom in? Okay, I'll keep it here. Nanna. Is this okay? Super. People, congratulations with this capital structure is officially done. Thank you. Hello, people. Let's revise leverage topic now. Okay, leverage is quite a easy topic. Not too many concepts and not too many questions also. Now let's run through and see how soon we can finish this topic because we're all hungry, right? Sure. Now, people, leverage, no. In simple terms, leverage means how one financial variable has an impact on another financial variable. How one component has an impact on another component. That's what leverage is trying to study. And which component specifically we are talking about is a fixed cost. How fixed cost has impact on EBIT and EPS. How fixed cost has an impact on EBIT and EPS. That's what leverage study is all about. If there is no fixed cost, then there is no requirement for this topic at all. If there is no fixed cost, absolutely this whole topic you can cut it and throw it. But unfortunately, we will have fixed cost, so this topic absolutely becomes relevant. Okay, that's a meaning. Okay, next, so there are 3 types of leverage we study here. What are those? Operating leverage, financial leverage, and combined leverage. These are the 3 leverages we study. Now people, if you have to draft the income statement from sales, you draft the income statement, or 1 minute, hang on. Leverage is a study of fixed cost. Hence, now the cost we segregate into two forms. You can analyze the cost in various forms. Like in accounts, we do direct cost, indirect cost, right? Since leverage is a fixed cost study, the cost we dissect or segregate into these things. We see what portion of cost is variable, what portion of the cost is fixed, because leverage is a fixed cost study. So in this format, if you're redrafting or putting your income statement, how does it look like? From sales, if you reduce variable cost, what are you going to get? Contribution. From contribution, if you reduce fixed operating cost, we're calling it as FOC. Fixed operating cost will include interest or exclude interest? This will exclude interest. So from your contribution, if you reduce FOC, what number you're going to get? We call it as EBIT. From EBIT onwards, same. Reduce interest, you'll get earnings before tax. Reduce tax, you'll get earnings after tax. Usually in these sort of problems, preference dividend is not there. So EAT only will become your EASH. Then finally divided by the number of equity shares to get the EPS. Done, Sarji? Now our first leverage, which is operating leverage, measures the relationship between topmost number. What is the topmost number? Sales and EBIT. Operating leverage is trying to measure the relationship between sales and EBIT. Now financial leverage picks it up from there. It measures the relationship between EBIT and bottommost number, which is EPS. Combined leverage measures the relationship between topmost number and bottommost number. What is topmost number? Sales. Bottommost number? EPS. That's what combined leverage is trying to measure. Yes, sir. Okay, now a little more pointers about operating leverage. So what did we say operating leverage measures? Operating leverage measures the relationship between sales and EBIT. That's one. Anybody remembers operating leverage ka formula? Contribution mein EBIT. We used to remember it as OL C. OL C. OL for operating leverage. C for contribution. E for EBIT. That is one way. Or another way, in case you have forgotten formula, leverage is anyway what study? Fixed cost study. Now tell me, in this initial stage, or anyway, operating leverage measures the relationship between here to here. In this setup, is there any fixed cost you are able to find? Yeah, FOC. FOC is your fixed operating cost. Take one number above fixed cost. Take one number below fixed cost. That's your leverage formula. One number above this is what? Contribution. One number below this is what? EBIT. That's your operating leverage formula. Contribution divided by EBIT. Clear up? There is another formula to get the operating leverage. Operating leverage again measures the relationship between sales and EBIT. So operating leverage is given by the formula percentage change in EBIT divided by percentage change in sales. Sir, this though they say it's degree of operating leverage, both the formula give you the same answer. Whether you use this formula or that formula, answer will be same. Now people, if they give you 1 year data, if they only give you 1 year data, we will use contribution divided by EBIT wala formula. If they give you 2 years data, because this percentage, sir, how do you calculate change? Sir, if someone tells you you have changed, how are they saying? They are comparing your new version with your old version. Then only they're saying change. So to calculate percentage change, we need current year data as well as previous year data. So we need one data point or two data points. We need two sets of data to compare and calculate the percentage change. So if they give you two sets of data or 2 years ka data, you can use this particular formula. If they only give you 1 year ka data, you will go for first formula. Or if they directly give you percentage change in the question, sales changed by 40%, EBIT changed by 10%. Like that, if they have given percentage change, then you can go for second formula. Otherwise, we prefer to use contribution divided by EBIT wala formula. Clear, Sarji? Whether you use this or this, answer is same. And some students will get confused because here in this formula, study material uses the term DOL. DOL means degree of operating leverage. Sir, you can call it as OL, as an operating leverage, or you can call it as degree of operating leverage, one and the same. Just because the question says calculate degree of operating leverage, it's not mandatory to use second formula. You can use first formula also. Any formula you can use, both are same. Done. This is one. Second one, there is another way again to calculate operating leverage using margin of safety. Anybody remembers that? Operating leverage is, we had measured. Remember one example, I had connected the dots. I proved it to you. Here again, we'll just take it. Operating leverage is given by the formula 1 divided by margin of safety. So now basically there are three ways to calculate operating leverage. Depending on the information given, we may use any of the three. Okay, sir. And operating leverage measures business risk. Operating leverage, we say, measures business risk, because operating leverage is trying to measure relationship between what to what? Sales, EBIT. Sales and all is affected by your financial decision or business decision. Business decision, like at what price to sell the goods, where to sell the goods, how to sell. All these are influenced more by your business decision. Hence, we say operating leverage measures what risk? Business risk. Clear? And if operating leverage, by chance, if you get it as 2, by chance you calculated operating leverage, you got how much? 2. What is the meaning of that? If you get OL as 2, what is the meaning, interpretation of that? Perfect. Sir, OL measures the relationship between EBIT and sales. So if OL is 2, let's say if sales is increased by 10%, EBIT will not increase by 10%, it will increase twice of that. That means EBIT will increase by 20%. That's the significance. Suppose OL is 4, and sales reduced by 5%, or maybe I'll take a different number. Sales reduced by 7%. Tell me what will happen to EBIT? EBIT will also reduce by 7%. No, 4 times of that. What is 4 times of that? 7% into 4. How much is this, people? 28%. But direction is the same. If one increases means other also will increase. If one reduces means other also will reduce. This is what operating leverage is trying to measure. Correct, sir? Any problem on the operating leverage calculation? Easy. Okay. What's the next leverage, people? Financial leverage. Financial leverage picks up from where OL left. Where did OL leave it at? EBIT. So financial leverage picks up from here. From here to bottommost number. What is the bottommost number? EPS. That's what we say. Financial leverage measures the relationship between EBIT and EPS. So this is affected by your financial decision, because after EBIT, what is the fixed cost you pay? Interest. Interest is a financial decision. If you take more debt, you have to pay more interest. If you take less debt, then less interest. I mean, this is a business risk or a financial risk. So hence we say financial leverage measures what risk? Financial risk. So financial leverage is given by the formula, same thing. So financial leverage is measuring relationship between here and here. No? Among here, what is the fixed cost you are able to identify? Interest is fixed every month, no, or every year. Take one number above fixed cost, take one number below fixed cost. That's your financial leverage formula. What is FL ka formula? EBIT divided by EBT. In case you have forgotten, you can visualize income statement and retrace it. That is one way to get financial leverage. Another is your percentage formula. Tell me the percentage formula. Percentage change in EPS divided by percentage change in EBIT. So one of the two you can use to get financial leverage. And it is known as financial risk. Okay, what about combined leverage? Combined leverage is the total risk. This is business risk. This is financial risk. Combined leverage measures the relationship between topmost number sales and bottommost number EPS. Hence, it considers the total risk. So, combined leverage is given with the formula simply OL multiplied by FL. OL multiplied by FL, if you automatically do, you will get the combined leverage. Or you can use percentage formula. What is the percentage formula? What is CL measuring? Sales and EPS. So, percentage formula will be percentage change in EPS divided by percentage change in sales. That also you can do. Done, people? This is all we'll have to do in particular leverage ka formula. Easy. Then a few more things are there. That's okay. And if you want this, we say financial leverage is a double-edged sword. Financial leverage is influenced by finance decision, no? As in taking debt. Sir, when you take a debt, it's a double-edged sword. Double-edged sword means what? That end also sharp. This end also sharp. You can use it and go like this, or you can also go like this. It can harm others and as well as it can harm you also. So that is what we mean by double-edged sword, because taking a debt has advantage also, taking a debt has disadvantage also. What is the advantage of taking a debt? Compared to equity, it is costly or cheaper? So it's a cheaper source of finance. And on this debt, you get a benefit called tax advantage. Disadvantage, is debt permanent capital or company has obligation? Obligation to pay interest also, obligation to pay principal also. Okay, now what if company does not have money to pay EMI? What will happen? It's a good thing for a company or bad thing? So if company does not have enough money to pay the interest, then eventually company may shut down. That only we call it as bankruptcy cost. Bankruptcy cost is a scenario where if you don't have enough money to pay the debt, then debt guys will start selling the assets. When the assets of company are getting sold, now if somebody takes away our laptop or iPad and all, can we conduct class? Difficult. No. So ultimately we may become, hopefully no, yeah, I'm just saying. So bankruptcy cost, that's your bankruptcy cost. Done now. So these are some disadvantages. That's what we mean by double-edged sword. Taking an debt has advantage also, disadvantage also. And one more way they ask the theory question is, they will say, okay, they will ask you to calculate and say whether it's a financial leverage or favorable leverage or unfavorable leverage. Now people, here how do you calculate that is, compare the return on investment. When you're doing a particular project, you will get a return, no? That we call it as ROI. What's the return? Just now previous chapter may be computed. ROEs. ROEs is a return. So compare the ROEs with the cost of debt. Here we're talking about debt, right? Right? Because fixed cost comes on equity shares or debt. Debt. So compare if the rate of return on investment, if the R, we call this as R, if the R is greater than your interest rate. If the R is greater than your interest rate. Here you need to be a little careful. One thing is, some mistake people can do. Sir, ROEs you can calculate on a before tax basis, or you can calculate ROEs on a after tax basis. We have done this in ratio analysis topic. If you remember, there are two formulas to calculate ROEs. One on a before tax basis, another one on a after tax basis. Now, if at all, if they give you in the problem ROEs on a before tax basis, ROEs on a before tax basis, will you compare with KD? KD is always on a after tax basis. If one is a before tax basis, can you compare other one on a after tax basis? Are they comparable? No. If you take ROEs on a before tax basis, then you will compare this with what? You'll compare with KD or you'll compare with interest rate? You'll compare with interest rate. If this is greater than the interest rate, then we say it's a financial leverage or a favorable financial leverage. If you take ROEs on after tax basis, now you will compare with the interest rate or cost of debt? Cost of debt. If the ROEs is greater than the cost of debt, then it will become what, people? Favorable financial leverage. If it's other way around, if it is lesser than the cost, then it will become unfavorable. This is a one marker theory question. Usually they will fit in this in the bigger question. Understood? So be careful on what you are comparing. If you take one number on before tax, other number also should be before tax. If one number is after tax, the other number also should be after tax. Now this scenario, tell me, what does it lead to? It's unfavorable or favorable? If simple, interest rate is a cost, ROEs is a return. If return is a greater than cost, it's a sad news or happy news? Happy news means unfavorable or favorable. So this we call it as favorable financial leverage. Done now. If it's other way around, what does the other way around do? What is the other way around? If ROEs on a before tax basis, if it is less, now you'll compare, if this is on before tax basis, you'll take KD or interest rate? Interest rate. Or ROEs on a after tax basis. ROEs on after tax basis, you'll compare it with interest rate or KD. If it is lesser means what does it lead rate to? Favorable or unfavorable? ROEs is a return, interest is a cost. If return is lesser than the cost, what does it lead to? Unfavorable financial leverage. Okay, Sarji. Done. This is another one, no? Okay, moving on to the next. Now another one is, this is okay, not that great. Okay, I'll move on to this. There are a couple of more formulas you need to remember for leverage. Leverage, hardly 6 to 7 formulas if you remember, good enough. One is break-even point. Sir, how do you get break-even point? 1 second. We have already done financial break-even point in capital structure topic. Now here also they're saying break-even point. Okay. Now people, can you find operating leverage through margin of safety? Can you find operating leverage using margin of safety? Yes. How? Operating leverage is given by the formula 1 divided by margin of safety. In order to calculate margin of safety, we also need break-even point. Okay. And operating leverage stops at what? It measures relationship only between sales and EBIT. Yes, no? I mean, this is financial break-even point or operating break-even point. Here, when we say break-even point, it is not financial break-even point, it is Operating break-even point. So what we did in capital structure and what we are studying in leverage, both are same or different? Financial break-even point means, tell me once again, what does it mean? Financial break-even point means how much should be EBIT so that EPS becomes zero. Here, operating break-even point means how much should be the sales so that EBIT itself becomes zero. Here the goal is to make EBIT zero. Clear, everybody? So in leverage, since break-even point helps us to calculate margin of safety, and margin of safety helps us to calculate operating leverage. This is not a financial leverage. This is a operating break-even point. That's the first thing. Now, how do you calculate break-even point? There are two formulas you must have done in your costing. If you want break-even point in units, how do you calculate? Fixed cost divided by contribution per unit. I derived this formula also for you in case you remember regular. Now it's anyway fine. Fixed cost divided by contribution per unit. If you want break-even point in value, then fixed cost divided by contribution percentage. That contribution percentage only we call it as PV ratio. How do you calculate GP percentage? GP percentage. Normal gross profit percentage. GP by sales into 100. Similarly, contribution percentage, you tell me. Contribution divided by sales into 100. That only we call it as profit volume ratio. PV ratio. You can call it as PV ratio or you can simply call it as contribution percentage. Done, sir. So if you want break-even point in value, this formula. If you want break-even point in units, this particular formula. But we'll need for leverage this one. Okay. How do you calculate margin of safety? Tell me once again. In fact, I used to tell you, break-even point means no profit, no loss. Margin of safety means profit zone. Margin of safety means profit zone. Now, let's say if you want just for 1 minute, I'll quickly explain this. So, let's say people, total sales, let's say is 10 lakh rupees. Total sales is 10 lakh. Let's say break-even point, not in units, but in value is, let's say, 7 lakh rupees. Is 7 lakh rupees, correct? Just an assumed number. Now, people, if you analyze, what is the meaning of this? What is the interpretation of this? Can you help me out? Up to 7 lakh sales, there is no profit, no loss, because in up to break-even point, what will happen? You will get profit or EBIT will be zero. EBIT will be equal to zero. Agreed? That means profit zone starts from where? Profit zone starts up to 7 lakh or beyond 7 lakh? Beyond 7 lakh. This we call it as margin of safety. At profit zone, we call it as margin of safety. Yes, sir. Now you tell me, people, how did you get this profit zone? How did you get this 3 lakh? Can you express an equation for me here? You did 10 lakh minus 7 lakh and you got 3 lakh. Tell me that in the same equation. Total sales minus break-even point in units of value now. If you do that, what are you going to get? Margin of safety. I want margin of safety in percentage. Tell me, how do you calculate? Same like GP percentage. How do you calculate? GP by sales into 100. Margin of safety in percentage will be margin of safety divided by total sales into 100. That is your margin of safety in percentage. Total sales minus break-even point sales. Total sales minus break-even point sales. The moment you do this, what are you going to get? Margin of safety in amount. We don't want it in amount. We want it in percentage. So divide this by what? Total sales. That's all. Okay, Sarji. That's your margin of safety ka formula. Any doubt or sorted? Alright, this is one. Another couple of things we should not forget in leverage wala formula is this. You see this in majority of the leverage wala question. I'll not worry about this and all. It's fine. That's okay. Now we'll focus on the things more which are exam oriented. Now, people, in leverage problem, usually examiner will not ask you straightforward leverage question. Like they'll not give you data and say calculate OLCLFL. It will be missing find the missing figure wala question. Right? They will give you some data. Some data will be missing. You'll have to figure out what data is missing and construct a balance sheet or an income statement. You have to prepare an income statement or a balance sheet. Usually, that sort of questions are expected from the leverage. So, there will be some missing figures. Okay. So, in such question, there will be some connections between the two things. One important connection which you can find in majority leverage question is this. In the question, they will say, they will give you FL and they will give you interest. They will give you financial leverage as well as interest. Tell me financial leverage ka normal formula. EBIT divided by EBT. EBIT divided by EBT. Visualize your income statement. Tell me from EBIT. Give me the income statement. Normal. From EBIT, if you reduce interest, what are you going to get? EBT. Stop there. Tell me that once again. From EBIT, if you reduce interest, what are you going to get? EBT. That means, can I substitute? Instead of EBT, I can write EBIT minus interest. Financial leverage will be given to us in the problem. Interest is already given in the problem. It means by doing the substitution, we can find what? EBIT. This is one connection which you see in many leverage wala problems. So instead of writing EBIT divided by EBT, financial leverage, we will rephrase. How will we rephrase it as? Keep the EBIT as it is. Instead of EBT, we will write what? EBIT minus interest. Financial leverage given, interest given. Through this, we can solve and get EBIT. That is one connection. Can I move on? Another way, there is a connection between operating leverage also. Tell me operating leverage ka formula. Contribution divided by EBIT. 1 minute. Go back to income statement and call out the income statement from sales for me. Sales minus variable cost. Contribution. Contribution less fixed operating cost gives you EBIT. That portion once again. Contribution less fixed operating cost is EBIT. That means instead of, what is the normal formula for OL? Contribution by EBIT. Instead of EBIT, can I substitute? What I can substitute as? Contribution minus FOC. You'll use this connection in the problem because they will give you OL and FOC. In the problem, you will see they would have given you operating leverage and FOC. Now, instead of EBIT, if you substitute it as contribution minus FOC. FOC given, OL given. So, using this, what you can find? Contribution. This is also a good connection. You will use this when operating leverage and fixed operating cost is given in the problem. This is more popular. This you will also see in few problems as well. So, don't forget this. Sometimes in leverage, you get stuck. When you're getting stuck, think on this and this. One more thing is, leverage, if you're still getting stuck, the best way to solve, according to me, leverage question, missing figure is, have the income statement. Have the income statement. Because when you prepare the income statement, few things automatically you'll be able to solve. I've proved it like at least 4 or 5 questions. In fact, every problem we have solved using income statement in our regular class. Right? So, if you're getting stuck, try to go with this approach. Fine, people. I think that's pretty much about leverage, people. Now we have some questions. Before that, can we quickly recap? So leverage is basically a study of what to what. How one financial variable influences another financial variable. Which variable are we talking about? Fixed cost. Due to fixed cost, how your EBIT and EPS is going to get impacted is what leverage is trying to study. 3 types of leverage. Operating leverage, financial leverage, combined leverage. Operating leverage measures the relationship between sales and EBIT. Operating leverage, we call it as business risk. And operating leverage ka another formula is percentage change in EBIT divided by percentage change in sales. Another formula for operating leverage, 1 divided by margin of safety. And how do you get margin of safety? For that, first we need break-even point. If you want break-even point in units, formula is fixed cost divided by contribution per unit. If you want break-even point in value, fixed cost divided by contribution percentage, or you can call it as PV ratio. How do you get PV ratio? Contribution upon sales into 100. Now, how do you get margin of safety? Total sales minus break-even point sales divided by total sales. That is your margin of safety. Financial leverage measures the relationship between EBIT and bottommost number EPS. So, financial leverage is given with the formula EBIT divided by EBT. One simple way to get it is one number above fixed cost, one number below. Okay, another percentage formula for financial leverage is percentage change in EPS divided by percentage change in EBIT. Financial leverage we refer to as financial risk. Combined leverage measures total risk and it measures the relationship between topmost number sales, bottommost number EPS. So, combined leverage is given by the formula OL multiplied by FL. Or another formula for combined leverage is percentage change in EPS divided by percentage change in sales. Okay. Alright, and don't forget another connection. If financial leverage and interest is given, normal way for financial leverage formula is EBIT divided by EBT. Here we will substitute. Instead of EBT, we will write it as EBIT minus interest. Another is operating leverage will be given, FOC will be given. What is the normal formula for operating leverage? Contribution by EBIT. Instead of EBIT, here we will substitute it as contribution minus FOC and get the contribution. That's quick fix. Maybe one more point you need to remember here is, now people, these three numbers, or you could say, yeah, these three numbers, they go hand in hand. These three numbers go hand in hand. If this increases by 10%, variable cost also will increase by 10%. Contribution also will increase by same. We have proved it to you with numbers. First example, if you remember, teacher example I'd give. But some of your new student, you will not be able to collect that. Now, these three will go in same direction. If one reduces by 10% means all will reduce by 10. One increases by 20 means all will increase by 20%. That's what I've written here. Go hand in hand. Girlfriend, boyfriend, these are. Okay. Sales till contribution. Similarly, from earnings before tax till EPS, from EBT up till EPS, all this will go hand in hand. From EBT up till EPS, meaning let's say EBT increased by 20%. What will happen to EAT? That will also increase by 20%. What happened to EISH? 20% increase. EPS also will increase by 20%. All same direction. From what? EBT to EPS. We proved it in the regular example. Now it's okay. Leave. This connection is important to people. This is a popular question from leverage. This connection. We'll solve one question also. I'll tell you. Can we move on? Okay. Next. I think we'll take up questions. So yeah, we'll try to do as many questions as possible in the before you become angry or whatever it is. Now, question number 9, again, study material question. This is very simple question, but I don't know why ICAI, this is, in one way, it is one favorite. I think even in this attempt, RTP or MTP, same question is there. Just a name or some values are changed. This is there in many RTPs, MTPs, as well as previous year paper. Just because it is repeated multiple times, I am doing it. Otherwise, very faltu question actually. Capital structure of the company they have given. They have equity share capital, how much? 10 lakh. Each share ka face value 100. So how many shares we have? 10,000. 10 lakh divided by 100. That is 10,000 shares. We have similarly debentures also. How much debenture? 10 lakh face value. That's fine. Now during the year, keep in mind during this is which year? 2021. That means what is the whole year? 1st April 2020 to 31st March 2021. That is your 2021 wala year. During this year, current year, sales has decreased to how many units? 1 lakh units compared to 1,20,000 units in the previous year. Last year, total units sold was 120. Current year, it is only 1 lakh. Fine. Sales they were given not in value but in units. What is the selling price per unit? Well, then it's easy, no? You take the number of units and multiply selling price. What are you going to get? Total sales of both current year as well as last year. Variable cost for 1 unit is 8 rupee. Sales minus variable cost again is contribution. So contribution also you can find it. Fixed expense were 2 lakh. Sir, in this problem, on this sort of problem, when they say fixed cost, it is always fixed cost excluding interest. Even though they say fixed expense, it is always what? FOC. That means including interest or excluding. How much is that? 2 lakh. Interest rate is 30%. Now you need to calculate OLFL at 1,20,000 units as well as 1 lakh units. That means they are asking OLFL for current year and last year. Sales, you know. Variable cost, you know. Sales minus variable cost is contribution. Contribution minus FOC is EBIT. You know already the debt value also. Where it went? Here. You know the debt value also. That means easily you can find everything. Any difficulty in this question? Faltu question just given. Quickly we will review. First, previous year. Previous year, how many units? 1,20,000. Current year, how much? 1 lakh unit. We want in units or value? Value. What? 1,20,000 units we have sold at what price per unit? 12. So last year sale was 1440. Current year it is 1 lakh into 12, which is 12 lakh. Variable cost per unit is 8 rupees. Sales minus variable cost is contribution. Minus FOC. So fixed cost will keep changing year and year or it will be same? It will be same every year. What is the fixed cost they have given? 2 lakh. For last year also 2 lakh. Current year also 2 lakh. From contribution, if you reduce FOC, you will get EBIT. From EBIT, you will reduce what? Interest. How much debt has this company taken? 10 lakh. What is the interest rate? 10%. So how much is the interest? 10 lakh ka 10%. Interest is 1 lakh. Same. Fixed cost, so same. From EBIT, reduce interest. You will get EBT. Tax rate given 30%. So EBT minus tax will give you EAT, profit after tax. Since there is no preference dividend, this only will become what? Each. Each divided by number of equity shares will give you EPS. So far, any problem? Now calculate, people. How do you get OL? How do you get OL? One number above fixed cost, one number below. So contribution divided by EBIT. 480 divided by 280 for last year. How much? 1.714. For current year, how much is it? 4 lakh divided by 2 lakh. How much? 2. That's for the current year. What about financial leverage? How do you calculate financial leverage? One number above fixed cost, one number below. EBIT divided by EBT. 280 by 180. 1.56. Current year. 2 lakh divided by 1 lakh. 2. Combined leverage not asked. If that asked means we would have multiplied those two. Okay. One more requirement they asked in question. What is that? Percentage change in EPS. Sir, leverage problem you can solve in multiple ways. You don't have to solve just like the way I'm showing. You can do other things also. Now, percentage change in EPS. How am I calculating is? First, if you want, you can calculate combined leverage. Because combined leverage measures the relationship between sales and EPS. Like that also you can calculate. Or I'll prefer to do it direct way. Last year, people, how much was EPS? 12.6. Current year, how much is it? 7. Last year, 12.6. No, yes, no? Current year, how much? 7. That means EPS changed. Yeah. It increased or reduced. From 12.6, it has become 7. So it has reduced. They did not ask EPS ka reduction. They asked change in EPS in percentage. We already did in cost of capital growth rate. Remember? How do you calculate? Change in amount. Numerator will be change in amount divided by original amount into 100. That's what I've written here. Change amount divided by original amount into 100. From 12.6, it has become 7 means what is the change? 5.6 is the reduce. Divided by original amount. Guruve, don't take original amount 7. Original amount means last year. Last year, how much was EPS? 12.6. So how much is it? 44.44. EPS is increased or reduced? Reduced. Because here EPS is reduced. No? From 12.6 it has become 7. So this is the reduction in EPS, which is how much? 44.44%. That's what they've asked. Problem over. Need a minute to review or sorted? Pretty straightforward question. Just repeat it so we have done. This is a good question. Remember I said some things go hand in hand? Call it out for me. Sales to variable cost to contribution. All this will change in same direction and by the same percentage. Then EBT to EPS. EBT to EPS. Everything will change in the same direction. Keep that in mind. EBT to EPS. Now that in mind, read this question. There is a couple of other ways also this question can be asked. I'll tell that to you later. First, let's review this question. Sales of this company called TM Excellence is how much per unit? 20 per unit. And is 20 lakh rupees. So selling price per unit is 20. This is rupees 20 lakh means this is the number of units or value. Sale ka value 20 lakh. Selling price per unit is 20. So if you do 20 lakh divided by 20, you will get 1 lakh units sold. Correct, Ajay? Contribution how much, G? 10 lakh. Sales minus variable cost is your contribution. Yes, no? Sir, yeah. So if they've already given sales, if they've already given contribution, can't you find out variable cost? As a balancing figure, you can find out if required. Check this. At present level of output, under current scenario, DOL means degree of operating leverage is how much? 2.5. Now, just because they have given DOL, we'll have to use percentage formula or any formula. Any formula, it doesn't matter. Basically, operating leverage is 2.5. Stop there only. What is operating leverage ka normal formula? Contribution by EBIT. Operating leverage is given. Contribution is given. So using this, what you can find? EBIT. So that means first working out you already sorted. Read the requirement of the, or maybe I'll go one line by line, it's fine. The company does not have any preference shares. Even if they don't say, we will assume the same. The number of equity shares is how much? 1 lakh. Applicable income tax rate is 50%. Interest rate on debt is 16%. What, read this line carefully, this is a requirement. What is the EPS? What is the EPS at sales revenue of 20 lakh? Currently, what is our sales? 20 lakh. So currently at current level they are asking EPS. They have given sales, but to calculate EPS we need sales or Isha. We need Ish. That means from sales we have to first arrive at Ish, right? So that's where income statement comes into picture. Okay, and then you will be able to calculate the EPS. That is one requirement. Second, they are asking amount of debt capital. Amount of debt capital means they are asking debenture ka amount. Okay, 1 minute, people. Is there any way to find out debentures? We have done this. Is there any way to find the debentures? Interest amount divided by expected interest rate. Here expectation, actual are same. How much is that? 16%. If you just find interest amount, I think we'll get that from income statement. You have interest amount, you have interest rate. That means easily you can find out debentures. Okay, now last part is the most important part of this question. If a 25%, the key word there is if. If means it has happened or hypothetical case. If this happens, if sales reduces by 25%, decline in sales, then what will happen? It will wipe out EPS. Wiping out EPS means EPS will become 0. If 25% reduction is there in sales means EPS will wipe out. That means can I say there is a 100% change in EPS? Why? Yes, no, everybody? If you have not got it, no issues. Here, let us say EPS was 5 rupees. EPS was 5 rupees. If sales reduces just by 25%. If sales reduces just by 25%. Why 25%? The question told. Then what will happen to EPS? It will wipe out. It will wipe out means now EPS will become how much? 0. Correct? Huh? From 5 it will become 0. Calculate the decrease percentage for me. If you want it in formula only. How do you calculate the percentage change? Change amount. Change amount andre? From 5 it has become 0. From 5 it has become 0. What is the change amount? 5 minus 0 is how much, people? 5. So change amount is 5 divided by original amount. Originally how much it was? 5 into 100. How much is this? 100%. Yes, sir. So when I wipe out EPS means obviously how much percentage change is there in EPS? 100%. 100% increase or 100% reduce? 100% reduction. That's what wiping out EPS means. There is a 100% reduction in EPS. Everybody got it? Pakka. Now 1 second, hang on. We are discussing the chapter of leverage. Is there any leverage which measures? Always keep the topic in mind so that you will be able to establish the connection. Here the topic is leverage. They are talking about sales and EPS. They are talking about sales and EPS. Do we have any leverage which measures the relationship between sales and EPS? Combined leverage. What is here? They have given percentage change, no? So that means we will use which formula? Percentage wala formula. Tell me combined leverage ka percentage formula? Percentage change in sale. Percentage change in rather EPS divided by percentage change in sales. How much percentage change in EPS is there? 100%. How much percentage sales change is there in sales? Numerator changes 100%. Denominator changes 25%. So therefore combined leverage is what? Indirectly they are telling combined leverage is 4. They could have directly told combined leverage is 4. Instead of telling that, they have given this. This last line is to say combined leverage is 4. Goinda, got it. Pakka. Now people, you know OL, you know CL. That means using these two you can find FL. Then you can figure out the missing components. That wala problem. Done now. First I'll do this. After that, remind me once about this line once again. I'll tell you at the end. They can rephrase this in another way, which they have done. First, let me finish this. I prefer, since I've asked EPS, I prefer to always put up what? Income statement. So first let's do income statement. I always prefer to, in fact, if you remember regular class, we always used to follow this format. Particulars, amount and one working call. If it is very simple working, we will show it here only. If it's a little more, then we will put up a separate working note. That wala. Okay. First have the income statement format. First you do it. What's the income statement format in leverage mein? Sales. Sales minus variable cost. Contribution. Contribution minus FOC. EBIT. EBIT rate minus interest. EBT. Reduce tax. EAT. Preference dividend not there. So, ish. That divided by number of equity shares gives you EPS. Have this format. They would have given you some values. Whatever value they have given in the question, first fill it out. Here, what and all we saw? Sales we saw 20 lakh. Contribution we saw 10 lakh. So this is given, fill it out. That means you tell me, is variable cost difficult for us? Huh? Sales minus variable cost is contribution. If this number is 20 lakh given, this number is 10 lakh given, variable cost has to be what? 20 lakh minus 10 lakh, which is what? 10 lakh. This is complex working or simple? Show it here only. Done now. Now FOC given or not given? Let it be. Fine. Anything else they gave? Check the question. Anything else they gave? We can fill it out. Nothing they've given. Yes, no? That's pretty much what they've given. Okay, now we'll have to figure out the missing components. First, operating leverage was given as 2.5. Have they also given contribution? What is operating leverage ka formula? Contribution by EBIT. So we use this connection first as a working note. Operating leverage is contribution by EBIT. Operating leverage given, contribution given. Therefore, using this you can find EBIT. How much is that? 10 lakh divided by 2.5, which is 4 lakh. Immediately when you get the data, go and fill up the income statement. Now EBIT, you got it from working note number 1. How much is that? 4 lakh. Now you know contribution, you know EBIT. Can't you find out FOC? This is 10 lakh, this is 4 lakh. Now if you don't put up income statement, you'll never be able to figure out what is FOC. Because it will not click that this minus this is your FOC. But when you put income statement, you automatically can get it as a balancing figure. So this is 10 lakh, this is 4 lakh, means FOC has to be what? 6 lakh. Sorted. So till here we have filled out. Can we move on to the next? Now again this question. They said 25% decline in sale will cause EPS to wipe out. Wiping out EPS means what, sir? 100% decline in EPS. Now EPS and sales, which leverage measures? Combined leverage. In percentage formula, what is that? Combined leverage is given by the formula percentage change in EPS divided by percentage change in sales. EPS is reduced by 100%, sales is reduced by 25%. So therefore, combined leverage is what? 4. We found that. What is a normal way to find combined leverage? OL multiplied by FL. OL multiplied by FL. Combined leverage, you know. OL, you know. Can't you find out FL? So therefore, how do you get FL? Combined leverage divided by operating leverage. You will get the financial leverage. Easy. And what is a normal way to calculate financial leverage? EBIT divided by EBT. EBIT divided by EBT. Now, do you know financial leverage? Yeah. How much? 1.6. I think you already found EBIT. How much is EBIT? 4 lakh. So, this one you know EBIT, you know. Can't you find out? EBT. So, EBT is missing figure. Find it out as what? 2,50,000. Yes, sir, Sirji. Go ahead and push it. EBT is how much now? EBIT found 4 lakh. So EBT is 2,50,000. If this is 4 lakh and this is 250, can't you find out interest? Balancing figure. What is that? 4 lakh minus 250. How much is that? 150. Tax rate is 50%. Now onward, simple. From 2,50,000, calculate 50%. You will get this. Yes, sir, people. Preference dividend is not there. Number of equity shares is given to be 1 lakh. You will be able to find out EPS normally. You just need to figure out what to start with. Then automatically each component will keep falling in leverage. That is your thing. Yes, sir, people. Did we solve the requirement, or what was the requirement here? What is EPS? I think EPS we have found. Next, they also asked what? Debt capital. Debt capital means they are asking you the debenture ka or debt ka value. How do you find that? Interest amount divided by interest rate. Do you know interest amount? Yeah, we got it from income statement. How much is that? 1,50,000. Interest rate is 16%. Interest amount is 1,50,000 and interest rate is 16%. 9,37,500. Problem solved. Clear, people? Paka? Now, same question they've asked one more way in previous year, some paper. Can I tell you what that is? Now, people, I told you something goes hand in hand. Sales, variable cost, contribution. Okay, that is over. Next. EBT, EAT, EPS. Here they've used EPS will wipe out. No? Instead of saying EPS will wipe out, they may say EBT wiped out. Or they may say earnings after tax wiped out. Or they may say wiped out. Or they may say EPS wiped out. One and the same. Instead of EPS, if they use any other number, or usually in that problem, they'd use net profit. Net profit means PAT. Net profit always means PAT. Whether you say profit before tax, profit after tax, or you say or you say EPS, it is one and the same. Instead of EPS, they'll substitute with one of those 4 numbers. But any differently you will calculate or same. If EBT is reduced by 100% means EPS also will reduce by 100%. One and the same, absolutely same step. Done now. This they've done. Instead of EPS, they've substituted in one examination paper with net profit. Net profit is simply your PAT. Same step, no change. So watch out for that. Done, sir. Okay. Can we review one more question? We have the energy left. I would want to do 2 more. Can I try 2 more? 2 is okay. Alright. This is also easy question but good presentation. So I would like to run through this question. Calculate OL, FL and CL from the following data. Under situation 1 and situation 2. Plan A and plan B. 2 situation, 2 plans. That means you have to calculate the data. How many? 4 case. Now check. Installed capacity is 4,000 units. Installed capacity means we have a capacity to produce totally how much? 4,000. Sir, just because we have capacity to produce 4,000, should we produce 4,000 or our choice? So how much did we actually produce? Check. Actual production and sale is only 75% of our capacity. So our capacity is 4,000. 4,000 ka 75% is how much? So actually we produced and sold in the current year only 3,000 units. Selling price per unit is, this is the number of units sold. What is the selling price per unit? 30. So you can find total sales. Variable cost is given. Sales minus variable cost gives you contribution. Fixed cost, no people. If it is first situation, fixed cost will be 15. If it is second situation, they are telling 20,000. Okay. Based on financial plan means what? Financial plan means raising the money. You can raise the money through equity or you can raise it through debt, any combination. Tell me, because of that, this is your FOC. FOC means what? Fixed operating cost. Will this change due to your financial plan? Due to your financial plan, which fixed cost will change? Interest. But FOC will change or no impact? FOC will not have any impact. Done now. Now, if you go for, there are 2 financial plans, A and B. If you go for financial plan A, you will take how much, you will raise how much money through equity? 10,000. How much money through debt? 10,000. So totally how much money you require? 20,000. And debt will come at what interest rate? 20%. Calculate the interest for me. What is the interest for me? If you go for plan A, 10,000 will be debt amount and interest rate will be 20%. So 10,000 ka 20% is 2,000. If you go for plan B, how much money will come through equity? 15,000. Correct only, no? If we go for plan B, how much money will come through equity? 15,000. How much money will come through debt? 5,000. Sir, 5,000 is a debt to, and how much is the interest rate of? 20%. So how much will be the interest amount? 5,000 ka 20%, which is 1. So based on your plan, what number is changing? Interest amount is changing. Under plan A, interest is 2,000. Plan B, interest is 1,000. No, it's a simple question. Just the format is thing you need to worry about. Operating leverage stops at where? Can you tell me? It considers from sales to EBIT. Based on your financial plan, what is the only data changing? Interest. Will operating leverage consider interest or it stops at EBIT? EBIT ka very full form is earnings before interest and tax. That means this will have any impact on operating leverage or no impact. That means I will not calculate operating leverage plan wise because plan is irrelevant for me. Correct? No. I will calculate operating leverage what wise? Situation wise, because based on the situation, your FOC is changing. It's just a matter of presentation. Okay. So how we'll present the operating leverages? We'll present it what way? Situation wise. To calculate operating leverage, I need what and all? Contribution, EBIT. Have they given or have they given sales? How much is the unit sold? 3,000. How much is the selling price per unit? 30. So what is the total sales? 90,000. Done now. Okay, whether it is situation 1 or situation 2, only one data will change, which is FOC. Sales will be same. What is variable cost? Variable cost per unit is how much? 15. How many units have you sold? 3,000. So calculate 3,000 ka 15. How much? 45,000 is a variable cost, both the situation. Sales minus variable cost is contribution. Contribution also same. Done now. Any problem? From contribution, you have to reduce FOC. Now be careful. If it is situation 1, how much is FOC? 15. If it is situation 2, 20. We are solving situation wise. First situation 15, second situation 20. So FOC for the first situation will be 15, FOC for second situation will be 20. Contribution minus FOC will give you EBIT. Any problem? Now how do you calculate operating leverage? Contribution divided by EBIT. 45 divided by 30 is 1.5. 45 divided by 25 is 1.8. What about plan wise? Should I have to worry about operating leverage, financial plan A, financial plan B, or irrelevant? Irrelevant, because financial plan A only impacts your interest. Is interest relevant for operating leverage or irrelevant? So that means operating leverage is only influenced by, in this problem, what? Situation 1 and situation 2. It is not impacted by financial plan A and B. Any problem? Clear or sorted? Now they asked only 1 or 3. OL, FL and CL. Next is to find out what? FL. Now FL, no people. For FL we need EBIT as well as, what is the formula for FL? EBIT divided by EBT. Correct? Huh? That means FL is impacted by interest. Do you agree with me? Because how do you get, tell me, from EBIT, how do you get interest? From EBIT you reduce interest and you get EBT. And interest changes as per the plan. Interest amount changes as per the plan. Correct? No? Now people, can I present the data only situation wise or also plan wise? Plan wise. Now financial leverage onwards, I'll present it plan wise. The way that they've given the data. Plan A and plan B. Check the careful presentation here. Financial leverage, I'm presenting it what way? Plan wise. Now first, I'll try to solve financial leverage of plan A under which situation? Situation 1. Like this. Plan wise, situation wise. Individually we'll have to go. Okay. Here just picking the right number is the crux over here. Remaining things are very easy. Sir, 1 second. We are in which situation? Sir, if it is situation 1, EBIT will always be how much? 30,000. Whether you are in plan A or plan B, doesn't matter. If you are in situation 1, EBIT is always what? 30,000. So EBIT, I'll copy both. Once more or got it? Once more got it. From EBIT, we have to reduce what? Interest. Now interest will be same under both the plan. Now we have already calculated. Here check. If you are in plan A, what is your interest? 2000. If you are in plan B, interest is 1000. So copy. For plan A, interest is 2000. For plan B, interest is 1000. From EBIT, if you reduce interest, you will get EBT. Now can you calculate financial leverage? How? EBIT divided by EBT. So divide 30,000 divided by 28,000. How much? 1.17. 30,000 divided by 29,000. 1.03. Correct? Now once again, you calculated financial leverage for both plan A as well as plan B. But for which situation? Situation 1. We have only one situation or one more? Now the same calculation, now we have to do it for situation 2. If it is situation 2, what is going to be your EBIT? Your EBIT is always going to be 25. Same. If it is situation 2, EBIT is always going to be 25 under both. Correct? Interest you already know. For plan A, interest is 2000. Plan B, interest is 1000. Reduce 2000, 1000, you will get EBT. How do you calculate FL? EBIT divided by EBT. 25 divided by 23. 25 divided by 24, 1.04. This is calculating FL both plan wise as well as situation wise. Done, Sarji? Now why I did not do the same presentation for OL? Based on the plan, based on this financial plan, what is changing? Interest. Is interest required for OL or not required? Not required. That's the reason we stopped at what? Situation level. Done now. Now last thing. What is last now? Combined leverage. Combined leverage we need OL also, we need FL also. I mean whatever presentation you did for FL, same presentation I'll continue for CL. Tell me that presentation. Particulars, plan A, plan B. Then situation 1. Now be very careful, just again picking the number. How do you normally get your combined leverage, people? OL multiplied by FL. Okay. Now careful here. We are in which plan? Financial plan A. We are in which situation? Situation 1. Careful. If it is situation 1, OL is always what? 1.5. Plan can be anything. If it is first situation, OL is always what? 1.5. Now, we are in first situation. That means OL is going to be 1.5 and 1.5. Because OL varies only based on situation. If it is first situation, again, operating leverage will always be what? 1.5. Now we are in first situation scenario. So OL will be 1.5, 1.5. Done now. But for combined leverage, we need OL also, we need FL also. Now FL varies based on situation as well as based on plan. Now, if you are in financial plan A and if you are in situation 1, what is your FL? 1.07. 1.07, correct. Same thing over here. If you are in financial plan A, if you are in situation 1, what is your FL, people? Here we just now got to 1.07. So multiply 1.07. That's your combined leverage. Easy. Same. Now if you are in plan B, if you are in financial plan B and if you are in situation 1, what is your financial leverage? 1.03. Now your financial leverage will be 1.03. That way you will get the combined leverage. Any problem? And now let's see how well you have understood. I'll show you the data. Now you calculate the CL for me, plan wise, situation wise. Take 1 minute, calculate. Let's see. I want to see whether you have really got it or Buddha Zona has come. I'll show you the data. Or maybe if you want, this is visible. For situation 1 and 2, OL is 1.5, 1.8. If you want, you can have that data somewhere, written it down. Now, if it is situation 1 and 2, OL is 1.5, 1.8. Now, if it is plan A, plan B, situation 2 ka FL is 1.08, 1.04. Situation 2 ka FL is 1.08 for plan A, 1.04 for plan B. Note this data, calculate CL for me. For situation 2, you will need to calculate combined leverage for me. Let's see. Situation 2 ka combined leverage. I don't know though, I'll check. You calculate. You note it down somewhere. 1.62. 1.872. Yes, so I don't know answer. 1.872 is right. 1.944 is the first answer. 1.944. Okay, perfect. Now, how do we calculate again? Now, same. If it is second, for combined leverage, what do we need, people? If you're confused, for combined leverage, what do we need? OL and FL. If you are in second situation, OL will always be what? 1.8. You can be in plan A, plan B, doesn't matter. If it is second situation, OL will always be 1.8. So fill up the OL. 1.8, 1.8. Now, only thing we need to multiply is what? FL. Now, FL, we are doing for which situation? Situation 2. For plan A, situation 2, FL is 1.08. So multiply 1.08. Same. For plan B, situation 2, what is FL? 1.04. So multiply 1.04, you'll get the answer. Done now. That's all. This is the whole crux is on the presentation here. Same question in one of the RTP, they asked for 3 plans. Here we solved how many? 2. There they asked for 2 situations, but 3 plans. That means here you will have to add one more column. Financial plan C. For operating leverage, should you have to add anything or same? Same. Method of solving is same, just that one financial plan has got it added extra. Done. Last question. Chudama, Paglama. Everybody okay? I'm saying, finally, Jai Allah Jesus Shiva. Finally, he's decided to leave. Okay, question number 18. Question number 18. Question number 18. In our book, I think it's a RTP May 24 wala question. So what is this? Just check. From the following financial data, prepare the income statement. You just need to prepare income statement. You already know income statement ka order. So what you do is first make the format. And whatever data they have given, fill it up. Missing figures, we will get it as a working note. First, let's do it for company A. Here, people, you need to prepare income statement for company A as well as company B. Everybody check the screen. For company A, variable cost given, fixed cost given, interest given, interest given, financial leverage they are saying is 5:1. 5:1 means simply 5 divided by 1, which is what? 5. They can say financial leverage is 5, or simply they can say 5:1. Okay, now, or another presentation if they want, they can say is 10:2, they can say. 10:2. 10:2 means 10 divided by 2, which is again what? 5. Usually they will not say like that. They'll use one wala presentation. Either directly they will say 5 or they will say 5:1. Okay. And now you already know this. The moment you see this, suddenly you should become more alive, awake. What is that? Interest is given, financial leverage is given. Is there any connection? Interest and financial leverage. Yeah. Financial leverage ka what is a normal formula? EBIT by interest, or rather EBIT divided by EBT, correct. But now will we use the same formula or substitute? Substitute. What is that substitute you will do? Instead of saying EBIT divided by EBT, instead of EBT, what you will write? EBIT minus interest. Financial leverage is given in the question. How much is that? 5. EBIT we don't know. Interest is given in the question. How much? 14,000. Solve. This you send it. 5 into EBIT will become 5 times EBIT. 14 5s are 70 is equal to EBIT. When you solve, you will get EBIT as 17,500. Done now. So more or less, one if you solve means the problem will be over. Okay, now just check if you want. I've prepared both A and B in same format, parallel format. If you want, you can present separately. First thing what I told people, fill out the data. What and all is given? Variable cost, fixed cost, interest. So first fill that. Variable cost given, and then fixed cost given, and then also interest given. Whatever is given, I have just updated. What did we get now just now? EBIT. How much we got it as EBIT for first company, A Limited? 17,500. Go ahead and immediately when you get the data, go ahead and fill it out. EBIT now we got 17,500. Interest you already know. That means you can fill out all the balance portion. From these two, if you minus, you will get EBT. Interest tax rate is given in the question somewhere. Check. Tax rate is how much? 30%. So reduce tax rate, you will get earnings after tax. Preference dividend not there. So you will be getting each. You can stop at each because they have not given number of equity shares. So you can't calculate EPS. Or you can leave dash dash. Dash dash here refers to no information given. Okay, people. That means from what portion to what portion we have filled. From EBIT to bottommost number, fully we have filled. Then see if you can fill out anything else. EBIT you found, FOC was given. So can't you find contribution? Sir, from this you have to reduce 26,500 and get 17,500. These two are given means what is contribution? These two ka minus or these two ka addition? Add these two, you will get what? 44,000. Because only from 44,000 if you reduce 26,500, you will get 17,500. So it's, you want to put a working note for this or very simple? Simple means show it here only. These two you add, show the addition over here and write the value. Okay now. This is 44 and variable cost is 88. That means what is sales? Minus add. These two you add. That's what we got. And sales. That means income statement for A Limited is double. Just only based on one connecting point, which is financial leverage and interest. That ICA uses in many leverage questions. So don't forget that connecting point. They asked only for A or also B. Now see what information they've given for B. Variable cost, they told us 50% of sales. Sir, you already know the equation. From sales, if you reduce variable cost, you will get the contribution. Now check. If suppose sales is 100. If suppose sales is 100. How much will be variable cost? 50% of sales. 100 ka 50% how much? It means contribution also has how much? 50. So is there any relationship here? Check. Variable cost of 50. Contribution also 50. That means they are different or same. That means can I write if variable cost is 50% of sale, contribution is also 50% of sale. If you do 100 ka 50%, automatically you will get 50. Done now. This is one connection. Fine. Interest expense given. Interest expense given. Then they give margin of safety. Using margin of safety, can you find any leverage? Operating leverage is 1 divided by margin of safety. So using this, we can find margin of safety. Tax rate they've given. EBIT they've given. Awesome. So two datas they've given, we can fill it out. What are those? Interest to EBIT. Interest is 11,000 given and EBIT is given. How much is that? Something else they give. EBIT is 14,000. Interest is 11,000. That means bottommost portion taka I can fill now. From EB80, if I reduce interest, these two are given. From EB80, if I reduce interest, I'll get earnings before tax. Tax rate is 30%. So you also know earnings after tax. Preference dividend not there. So each is 2001. So from EB80 all till the bottommost number, we have filled it up. Now the only thing is to figure out the uppermost portion. How? They gave margin of safety. Using that, what we can find? First find that. OL is nothing but 1 divided by margin of safety. Done now. Okay. What is margin of safety ka normal formula? Operating leverage ka normal formula. Contribution by EB80. Do you know EB80? Yeah, they only given in the problem. How much? 14,000. Operating leverage just now you found. EB80 any which way they have given. So using these two, what you can find? Contribution. Operating leverage is contribution by EB80. Operating leverage we found it to be 4. EB80 question only they have given 14. So what is contribution? 56,000. Done now. And variable cost, once again, go and fill it up. How much is the contribution? 56,000. Sir, EB80 is 14. Contribution is 56. Therefore, FOC has to be what? 56,000 minus 14,000, which is 42. Done now. Now, if contribution is given, can you find out sales? They told variable cost is 50% of sales. They told variable cost is 50% of sales. Therefore, contribution is also 50% of sales. Contribution amount, you know, contribution is 50% into sales. Therefore, sales is what? 56,000 divided by 0.5, which is 1,12,000. Done now. Any problem? So, sales is 1,12,000. This you know. That means variable cost, you can arrive it as a balancing figure. That's all as this question. A simple questions. Like this, no, usually if they want to make it more build up, they will give them more missing figures they will add, which can make the question little lengthy. Okay, but otherwise leverage, yeah, it's overall manageable topic. Last 2-3 attempts they have asked leverage some good little brain spinner wala question. Otherwise, usually leverage you expect pretty straightforward questions only, because it doesn't make sense to ask too complex question from leverage, because it comes only for 4 to 5 marks. So usually they keep it very simple. Only in very rare attempts leverage they kind of twist and turn. We will see in one of this attempt RTP. They try to make a little twist out of it. But okay, fine, we can manage. Yes, sir. Now, okay, everybody sorted. So I think this we have done our today's target. I think we have completed. This is a repetitive question, so it's fine. All right, people. Thank you. Hello, people. Happy morning. So today we are continuing our marathon discussion. So let's quickly revise investment decision topic with the help of our short book itself. Now, investment decision and working capital management are usually considered to be our big ticket topics in FM. Usually 8 marker or 10 marker, anything beyond 6 marks if comes, usually they'll pick from either this topic or working capital management. That's usually the way ICI prefers it. Okay. So now let's see what we can learn from this particular topic. Now, investment decision. Investment decision ka whole funda is we'll have to take a few decisions over here, like whether to buy a new machinery or not, whether to buy a new fixed asset or not, or if you already have a fixed asset, should we replace it with a new asset? Should we take up a new project or not? All this decision comes under the scope of investment decision. Now, investment decisions we take with the help of a particular technique. That technique is what, people? Capital budgeting technique. That's a technique used basically for our investment decision. Capital budgeting is not a method. It's basically a name line, tagline given. Under this capital budgeting, we have various methods. Okay, that's what we have to keep studying. Why this investment decision is important is, now these sort of investment decisions, right, they're not pretty straightforward. Like, just to give you an example, let's say a company wants to buy a plant and machinery. They have two options. One, they can buy it locally. They can buy it in India itself by paying how much money? 8 crore, and the life of the asset will be 8 years in this particular case. And if you buy a local machinery, you can use that machinery for how many hours a day? 10 hours every day. Now there is another option. Same machinery you can import from 9 crore by paying 9 crore from Japan, but the life of the asset is what? 8 years, but you can use it for 12 hours a day. Now the question is, should we buy it locally or should we go for import? It's not pretty straightforward, because all this, once you buy an asset, this amount, 8 crore, 9 crore, small amount to big amount. So this investment decisions involve a huge capital outflow. 9 crore, 10 crore, 100 crore, 500 crore, like this. So the impact of all this is quite big, and it is quite on the long run. Because see, once you take a decision, you have to keep that decision for how many years here? 8 years. That's not a short period at all. So hence we need to be a little careful while taking the decisions. Hence certain techniques were required for us to help us in making this particular decision. That's all we'll be doing in this particular topic. Okay. Now people, majority of, like as I said, capital budgeting is just a name line. Under that we have various methods. Majority of the methods, some of the methods you already know. What are those? Payback period, accounting rate of return, NPV, IRR, MIRR, profitability index, etc., right? All those are methods under capital budgeting. Almost every method that we see under capital budgeting works with the help of cash flow. They don't take the decision based on profit. Decision is based on cash flow. In majority of the problem, investment decision problem, cash flow will not be given. We need to find the cash flows. They will usually give sales. They will usually give the data for sales. Now from sales, we'll have to arrive at cash flow. Now people, you already know from sales, how do you get PAT? Tell me that. From sales, how do you arrive PAT? Once from sales, you will reduce variable cost. Variable cost, if you do, you will get contribution. Contribution minus FOC, fixed cost. All that exact format is not required over here. From sales, if you reduce all expense. From sales, if you reduce all expense. All expense could be your variable cost, fixed cost, interest, everything, depreciation, everything put together. From sales, if you reduce all expense, automatically you will get earnings before tax. From that, you reduce tax, you will get earnings after tax. This earnings after tax or profit after tax, another name is net profit. Whenever in the FM they use net profit, or for that matter, even in accounts, if they say net profit, it is always profit after tax. Till here, normal protocols. Fine. After this, what do we do is, since we need cash flow, now people, is depreciation already reduced? Yes. Why we need to reduce depreciation? Because depreciation is a expense. It is non-cash expense, but it is still a expense. All expense first you need to reduce, then only you will get profit before tax. No, correct? Then only you will be able to find out the correct tax amount. To find correct tax amount, we have to reduce all the expenses including depreciation. But we need profit here or cash flow? Cash flow. Because of depreciation, you have already reduced depreciation, but because of depreciation, cash outflow happened, or it's a non-cash item? Non-cash item. Hence, once you find out PAT, first adjustment you'll have to do is depreciation. You need to add back. Why? You have reduced it here. For the purpose of determining tax, you have already reduced depreciation. But if you reduce 1 lakh depreciation, did cash go out to the extent of 1 lakh? Or it's a non-cash? Non-cash. Hence, what do we do? First adjustment, what we do is add back depreciation. Got it up, people? Because why? What's the logic of that? It is a non-cash expenditure. That is the reason. And we need cash flow over here. That's one. Another one is, we used to remember in class, so this we'll call it as OVAS. We'll remember it as what? OVAS. After depreciation, 4 adjustment. N grow, OVAS. O for opportunity cost. W for working capital. A for additional capital introduced. S for salvage value, it could be, subsidy it could be, or it could be STCL or STCG. I'll tell you all of this in the problems one by one. Okay now people? So it's a normal question, but since they will not give you 1 year data, like here in my example, what was the useful life of the asset? 8 years. That means you need to estimate the cash flow for 1 year or 8 years. 8 years. Hence the problem can become lengthy, because all this step you have to do not just for 1 year, you have to do it for 8 years. After that, you will get the cash flow, and then you can apply the respective capital budgeting method. So this becomes a working note. Everybody got it? Everybody got it? Just to be on a safer side, quickly I will recap this OVAS adjustment. Then when it comes to the problem, again we'll discuss a little more. O for what, people? Opportunity cost. Opportunity cost here simply means sacrificing cost. Like here, I used to give the same example in class if you remember. Now I'm teaching. My full-time profession is now teaching. Am I working in corporate now? Sir, if I was working in a corporate, I would have got corporate ka salary. Corporate ka salary. Let's say my salary would have been 30 lakh. My salary would have been 30 lakh. Let's assume. Okay, now you're getting excited. Just an assumption. Okay, 30 lakh, let's say, used to be my salary if I used to work in corporate. Now I'm getting this 30 lakh or gone? Gone. That means that becomes what, people? Opportunity cost. Opportunity cost means the cost of letting go something. Done now. Now here you tell me this 30 lakh income I am getting or not getting? Not getting. In cash flow estimate, no, how do we do it is, if it's an inflow, we show it as a positive number. If it's an outflow, we show it as a negative number. Okay, now you tell me this opportunity cost of 30 lakh, I should show it as positive or negative? This 30 lakh, I should show it as positive or negative? Now, this, if I used to work in corporate, I would get this income. Then I would have written plus 30 lakh because I would have got this income. Now I'm getting this or letting go of this. I mean, this income is reducing. Income is a positive number. That is getting reduced means I should show this 30 lakh here as a positive number or negative number? Negative number. So basically in my example, opportunity cost, you will show it as minus 30 lakh. Done, people? But in some problems, my opportunity cost can also be a positive. Opportunity cost ka signs could be on the positive side or it could be on the negative side. It depends on the question. Okay, here one income I lost. In my example, one income I am losing. Hence, I am showing it as what? Negative. Suppose I avoided one cost, Andre. I avoided one cost means what? Positive or negative? Cost is an outflow. That I am incurring or I am avoiding. If I avoided a cost means it becomes a benefit. Then it will become opportunity cost will become a positive. So you have to read the question. One income you are losing or one expense you are losing. One expense if you are losing means it will become a positive number. One income if you are losing means it will become a negative number. So you have to read and accordingly figure it out. Hence opportunity cost I have written plus minus because it depends on the question. So O is comfortable. W for working capital. Now people, whenever we do a project, like let's say now we want to open a branch in Hyderabad. If you want to open a branch, we want fixed asset also, right? Fixed assets like furniture or TV, AC and all we need to invest. Only that alone is sufficient or we need some money for day-to-day operations also? We need to invest some money for day-to-day operation also. That means when we need to invest? After 10 years or now? Now. Hence, whenever they give you working capital, at year 0, you will take it as what? Negative number. Year 0 means what? Now. When am I investing this working capital? Future or now? Now. Hence, and investment means, if I'm making the investment means money is coming in or money is going out of business. Money is going out. If money is going out means positive or negative? Negative number. Done now. Now, once we do a particular project, will we let go of that working capital investment or we'll recover that also? See, business means whatever investment we have made, we want to recover. Yes or no? So, initially at year 0, my working capital will be negative. At the end of the project, working capital will become a positive because we would like to recover. Actually, working capital recovery can happen any year. It can happen in first year, second year. Suppose project life is 5 years. Project life is 5 years. Working capital recovery can happen in year 1, year 2, year 3, year 4 or year 5. Any year. But it will not be given in the question. Which year working capital got recovered will not be mentioned. Hence in FM we make a normal assumption. What is that? End of the project we will recover. This is just a convention. But actual recovery can happen any year. But for our problems, what we'll do? At the end of the project, in my example, what is the life of the project? 5 years. That means year 5 working capital, you will take it as a positive number because you are recovering this. Done now. That's your W. O over W over. A for additional investment. Sometimes people, when you're doing a project, you will have to invest entire money at year 0 or you may have to invest in installment. You may have to invest in installment. Maybe let's say 10 crore rupees at year 0. 1 crore rupees at the end of year 2. Possible. Investment also can come at multiple installment. So this year 2 ka whatever you are investing, that we are calling here as what people? Additional capital or additional investment. Whatever. It will be given to you in the question. These are not that frequent. Some questions will have it, some will not have it. If you have it, bring it in. Yes, sir, people. Additional amount if you are investing means money is coming in or money is going out? Going out. So positive or negative? Last is S. S for salvage value. Now people, when we have a desktop, right, to do this particular open a new project in Hyderabad, new branch, We have purchased a, let's say, computer. Computer will come forever or a few years. Let's say computer ka life is 4 years. Computer ka life is 4 years. At the end of 4th year, what we'll do? Now this is not of much use to us. At the end of 4th year, we will sell it. When we sell it, we will pay the money or get the money. So salvage value outflow na inflow na. Salvage value is an inflow. You will get it every year or only once? Once. Usually at the end of the project. Done na? Hence at the end of the project, you will take salvage value as a positive number. That is one. And or it could be a subsidy case also. Subsidy means, again, there is a rare adjustment. Sometimes government has some initiative to promote a particular sector, etc., etc. Now, government is giving a lot of benefit for MSME sectors by giving loan at a lower rate. They're giving a lot of benefits, right? Like that, if you're getting any benefits from government, show that also. That question will specify, if at all it is there. Danaji, the question will specify when you will receive also. You may receive at year 0, year 1, year 5, whatever. So based on that. So now you tell me this subsidy we are paying to the government or receiving from government. Hence subsidy will show it as what? Positive number. Which year? Question will specify. Okay, I've just written end of the project here, but it could be whichever year as per the question. That is one. STCG, STCL, I'll take up a little later. Leave that. STCG is your short-term capital gain. STCL is your short-term capital loss. I'll take you through one question later. This, if you do, finally you will get what, people? Every year ka cash flows. Now, based on this, we do some adjustments that we will see each method onwards. Done now? Okay, give me a walkthrough of this. What have we studied so far? All the methods. Basically, this technique we call it as what? Investment decision ka technique. We gave a fancy name. What is that fancy name? Capital budgeting. Under capital budgeting, we have various methods. Majority of the methods does not use profit. They use cash flow. And cash flow will not be given to us and we need to estimate. What they will give to us in the question? Some benefit like sales and some expenditures they will give. So from sales, how do you derive cash flow? First take sales and reduce all the expenses. Whether it could be variable expense, fixed cost, depreciation, doesn't matter. Reduce all the expense. You will get profit before tax. Reduce the tax amount. You will get profit after tax. That only we call it as PAT, EAT or net profit. From net profit, 5 adjustments. Every problem. First, add back depreciation. Why? Depreciation we have already reduced, but cash did not go out. So hence it's a non-cash expenditure. So add back. After that, O was. O for opportunity cost. W for working capital. A for additional capital investment if required. S for salvage value or subsidy. Okay. Opportunity cost can be positive or negative. If it is income avoided, if you have lost in income, then opportunity cost will be negative. If it is cost avoided, then it will be a positive. Then W for working capital. At year 0, you will invest working capital. So at year 0, working capital will be negative. At the end of the project, we will recover it. So it will be a positive. A for additional capital. Additional capital will be an outflow. Which year? Question will specify. It can come in any year as per the question. S for salvage value. Salvage value is an inflow only at the end of the project. Subsidy again can come at the any day or any time as per the question. By that, you will get the cash flow. Okay, people. Now, can we go into the techniques one by one? Okay. You updating anything, Ada? Okay. All right. Now, let's go for the one technique. Sir, if it's easy technique, we will just take a small example and finish it off, right? So, if it's a major technique, whatever we say, we'll apply in some problems. Like that, we'll try to cover the almost everything. Okay, first technique of investment decision is, people, or rather, if you want to segregate capital budgeting techniques, broadly they're classified into non-discounting techniques or traditional techniques and discounting techniques. Non-discounting techniques, discounting techniques. Non-discounting technique means they don't give a damn about present value, future value and all. They just take the number as it is and work out. So that means here we use discount factor to find the present value. How do you find present value? Take future value of cash flows, multiply by the discount factor. Yes, no. That's how you get the present value. These techniques don't need the help of discount factor. Hence, they are called as what? Non-discounting techniques. Under this, we have payback period, ARR. Payback period and ARR. Payback period. First technique, payback period. Payback period means, name itself is saying payback period. This particular method is trying to say in how many months or in how many years we will recover our initial investment. In how many months or in how many years we will recover our initial investment. That only is what we call it as payback period. Comfortable, people? Okay. Now here, if again, as I said, this particular almost all capital budgeting techniques works based on profit or cash flow. Cash flow. Now you need to check if every year ka cash annual inflow, every year ka net annual cash inflow, whether it is constant or fluctuating. If every year cash flow, if it is constant, means if it is same every year, means then payback period is simply given by the formula initial investment divided by annual net cash flows. If every year cash flow is same, means payback period is simply given by what? Initial investment divided by annual cash inflow. Like over here, check. Initially, we have invested 12 lakh rupees. When did we invest this? Year 0. How much have you invested? 12 lakh. Let's say NCF. NCF as in net annual cash inflow. Every year net cash flow is how much? 3 lakh. Now use your common sense. Payback period means in how many years will you recover your initial investment, which in this case I have assumed it to be 12 lakh. And every year you are recovering 3 lakh means in how many years will you recover 12 lakh? 4 years. Not only payback period is given as formula. Now tell me the formula, how did I get 4? 12 divided by 3. That is nothing but initial investment divided by net annual cash inflow. You can use this formula only if the net annual cash inflow is constant every year, if it is same every year. If it fluctuates means, then we have to use something called cumulative approach. Like look at this example. Project ka life is 5 years, I assume, and every year ka cash inflow same or changing. Change. Initial investment is same. How much is initial investment? 12 lakh. Now is cash flow same every year? No. So formula will not work. We have to find something called what? Cumulative cash flow. Cumulate means, the name itself is saying accumulate or cumulate. Cumulate means adding up. So how do you find cumulative cash flows? This we need to find out, or in these cases, this will be given to us in the question. Cumulative cash flow, how do you find? Just by adding the cash flow. First year, anything to add or only 1 lakh? So first year cash flow will be same. Second year, what will be cumulative cash flow? First year ka, second year ka put together. So 1 lakh plus 2 lakh, how much is that? 3 lakh. Next it will be 3 lakh plus 4 lakh, how much? 7 lakh. Next it will be 7 lakh plus 5 lakh, how much? 12 lakh. 12 plus 6, how much? 18 lakh. Now how much did you invest? What is your initial investment? 12 lakh. Any year is having this number 12 lakh, check. Yeah, at 4th year we are able to see 12 lakh. That means what? We are able to recover our 12 lakh within 4 years. That directly your payback period. Manageable. That's your cumulative method. Okay, Sarji. They will not ask. Let's assume initial investment is 14 lakh. Let's assume initial investment is 14 lakh. Now check, any number is having 14 lakh in cumulative column. No. So now what to do? Last problem, it was very easy because 12 lakh exactly you found at 4th year. So therefore payback period itself is 4th year. But now we have modified initial investment to be how much? 14 lakh. 14 lakh, are we able to see it here or not able to? So how to solve in that case? Now check, up to 4th year, how much have you recovered? 12 lakh. Up to 5th year, how much have you recovered? 18 lakh. But we want to recover how much? 14. Can I say 14 lakh falls between these two? That means it falls somewhere between year 4 to year 5. So that means we can conclude payback period is somewhere between year 4 to year 5. Somewhere between year 4 to year 5. Now you can do that cross multiplication and do it as I have shown in class. Or for exam, we will use simple formula. That is much easier, right? So in this case, what you have to do is, payback period is between what to what here in my example? 4 to 5 years. Take the lower number. What is the lower number among year 4 and year 5? 4. Start with that. 4 plus required cash flow divided by actual cash flow. Lower number plus what? Required cash flow divided by actual cash flow. Now people, we are at till 4th year, how much have you already recovered? 12. How much we want to recover totally? 14. From 12, if you want to go to 14, how much we want to recover more? 2 lakhs more. So required cash flow will be, start with a lower number. What is that? 4. Plus required cash flow will be what? 14 lakh minus 12 lakh. How much is that? 2 lakh. Divided by actual cash flow. For 5th year, what is your actual cash flow? 6 lakh. Either you can do like that or 18 minus 2. How much did you recover? 6 lakh. Do this. How much are you going to get? 4.3 years. This simple thing. Done now, people. That's how you calculate payback period if the numbers don't exactly match. Lower number plus what? Required cash flow divided by the Actual cash flow. You can use this. I've shown you other method also in class, but that's fine. That's a logical method. But I think this works better for examination. You can do it faster. This is your payback period. Any doubt in first technique? Easy. Now we'll not take up any question on this. We have already covered everything with an example over here. Pretty simple. Okay. Usually, if this question alone comes, it will be for a 2-marker. Otherwise, they'll club this with a bigger question. Like that. They will ask 4-5 methods and make this payback period as a 2-marker question. That way also can be asked. Can we move on to the next technique, people? Under traditional technique only or non-discounting technique only, there is one more method called ARR. Or maybe I'll cover off this first. This is not really a technique, it is just an extension. No? Payback, reciprocal. People, you have done maths. How do you get reciprocal? Ulta, reverse. So payback reciprocal means it will be reverse of payback period. So payback reciprocal, how do you get? PR. 1 divided by payback period. If you found out payback period, let's say payback period is 5 years. Payback period is 5 years. How do you find payback reciprocal? 1 divided by 5, which is nothing but your 0.2 or 20%. That's your payback reciprocal. Okay. All right. Now, why do we find payback reciprocal is some people have done an analysis that payback reciprocal will be almost equal to IRR. It will approximate to IRR. IRR we already discussed in cost of capital. Right? So payback reciprocal will be approximating to what? IRR if one condition holds good. If life of the project is twice the payback period. If life of the project is 2 times the payback period. Now suppose payback period is 3 years. Payback period is 3 years. Let's say project ka life is, let's say, 7 years. Project ka life is how much, people? 7 years. Okay, now check what has happened. If you find payback reciprocal will be more or less equal to what? IRR, provided one condition holds good. What is that one condition? Life of the project should be at least 2 times of the payback period. Do 2 times of payback period, how much are you getting? 6 years. That means project ka life should be 6 years or more. It should be, the keyword there is at least. At least means 6 years or more. Here, what is the life? 7 years. That means there is another shortcut way to find out IRR. So can you use this in problem? Don't. If they ask IRR, do use your normal interpolation formula. Only if they ask payback period. Usually this gets asked as a theory. 2-marker theory they ask. Explain payback period. For that I have written 2-3 points. Okay. And don't say I will find payback reciprocal and call it as IRR. You will not get marks. When they ask IRR, do in the normal fashion. This is just for theory in examination. Done, na, sir? So this is basically an extension, not really a method. Next one is something called ARR. ARR means accounting rate of return, or also you can call it as average rate of return, or also known as book value rate of return. Any name. Same, everything is same. Now people, you can find ARR in 3 ways. Right? One is a faltu one. We'll not use it for exam. Leave that. We'll explain 2 methods. One. And first, before that, sir, ARR is the only capital budgeting techniques which uses PAT. ARR is the only capital budgeting technique which uses PAT. Rest all the techniques use cash flow. ARR is the only thing which uses what, people? PAT. So ARR is simply given by the formula. Method 1 to find ARR is take the average PAT. Take the average PAT divided by initial investment. Average PAT divided by initial investment. That is method number 1 to find out ARR. Second method, take the average PAT in the numerator divided by the average investment. I feel this is a better comparison, because numerator if there is average, denominator also it should be average. But ICI books allows both. Okay, people. But this is easier for exam, because initial investment will be given to you in the question. Average investment we have to find. So your call what you want to do. Fine, now both are acceptable as per ICA. Or if you want, you can go one step ahead and solve under both the methods and ask the examiner, you choose whatever you want, much. Like that also you can leave it. But both are acceptable. Yes, sir, people. How do you get ARR again? Average PAT divided either by initial investment, or you can use average investment, your choice. How do you find average investment? Actually, a simple formula to find average investment is initial investment plus salvage value divided by 2. That's all it is actually. Initial investment plus salvage value divided by 2. I proved this to you with an example in regular class. Leave that. Right? But our ICA will not use this. They have a fancy formula. To find average investment, it is half, 1/2, half open the bracket, initial investment, here I've written, minus salvage value, close the bracket, plus salvage value plus working capital. So we'll be using this only for our examination. Fine. Now for testing purpose, if you want, you can remember, you can just check in case you forget this formula, or if you're not sure whether what answer you've got is right or wrong, simply you can do initial investment plus salvage value divided by 2. The numbers should match. Fine, people, but you don't use this for examination. How do you find average investment? This way only. Okay, now not any other way, because our study material does not recommend this, only this. Done now. Okay, one more I'll tell, maybe I'll take you through one question as well. First of all, how do you find average PAT? If they give you 5 years ka PAT, how do you find? Now, this method and all uses time value money concept or no time value? No time value. That means you can use simple average. No weightage wala drama. It is simple average. How do you find 5 years ka simple average? Add all the years ka profit divided by 5. If any year has a loss, means profit means you will add, loss means you will subtract. That's all. Add all the profits and divided by the number of years. That will give you what, people? Average PAT. It's a simple average because there is no time value money concept over here. That is one. Now another way this particular question can be asked over here is, sometimes they will not give you average, sometimes they will not give you PAT. In the question they will not give you PAT. They will give you cash flows. What they will give you? Cash flows. They will give you cash inflow and they will give you cash outflow. Cash outflow will happen at year 0. Cash inflows will happen over many years. Like that they will give 5 years, 10 years ka cash inflow they may give, and year 0 ka cash outflow they will give. So how to do it? It's a simple interpretation. If they don't give PAT, but for ARR we need PAT, but they have given cash flow. How to get it is very simple. Cash inflow, you will interpret it as income. Cash inflow, you will interpret as what? You will use it as a income. Cash outflow, you will use it as a expense. How do you get profit? Income minus expense. Income minus expense. But they will give you 1 year ka income or let's say 5 years ka. They have given you how many years income? 5 years ka. That means what you will get? Tell me, how do you calculate here? If they give you 5 years ka income, and if they give you 5 years ka cash inflow and year 0 ka cash outflow, what you will do? Add all the 5 years ka income. That way you will get income for 1 year or 5 years. So that's what is the first thing I've written here. Take the total cash inflow minus what? Total cash outflow. When you do this, you get average PAT or total profit. Since this is total cash inflow and this is total cash outflow, you will get the total profit. You want total profit or average profit? So how do you get average profit? Take the total profit divided by the number of years. In my example, number of years was 5 years. So by that will become your average PAT. This is a substitute. This is not actual way to find PAT. This is a substitute way just to work out the problem. Done, people? This is another way through which they can ask. These are the 2 ways ARR adjustment can be asked. Otherwise, ARR is pretty straightforward adjustment. Any drama? Sorted. Paka? Is it okay? First, I will run through all the methods and then we'll take up all the questions. That way we can revise the concept once more if required. Comfortable with you? Okay. Can we move on? That's about ARR. But remember, ARR doesn't use cash flow, it uses PAT. That's only, hence the name. This is the accounting rate of return. In accounts, maybe we don't work cash flow. We have profit. Correct? Okay. Done. Next. Next, people, are discounting techniques. Previously, we saw non-discounting techniques, or another name, traditional techniques. They used discount factor or no discount factor? No discount factor. But discounting techniques will use the time value of money ka concept. So under this discounting techniques, you will see NPV, profitability index, IRR, etc., etc. So first discounting technique is NPV. You've already done this, people. Tell me, how do you find out NPV? Present value of cash inflow minus present value of cash outflow. That will give you NPV. Done. And what is the decision rule? Look at the name, net present value. Net present value. And how do you get that? Present value of cash inflow minus present value of cash outflow. So if NPV is positive, that means from that project you are getting a benefit. Okay, so what's the decision rule? If NPV is greater than or equal to 0, if NPV is greater than or equal to 0, then you will reject the project or accept. Accept. If NPV by chance is negative, then you will reject the project. Because NPV basically is trying to calculate the benefit. If benefit is positive or 0, accept. If benefit is negative, reject. Why 0 also we accept it? Sir, when NPV is 0, are we making any profit? No. Are we making any loss? No. So that means whatever we are recovering, whatever we invested, we recovered. Hence at 0 also you can accept. There's a change. Earlier we used to say at 0, it was company choice, whether they can accept or they can reject. Now they have modified the things in our study material. 0 means decision now is accept. And then sometimes they also ask you decision rules, so do remember that. In fact, I think in one of the RTP or MTP this attempt they ask decision rule, theory of NPV, profitability index, etc., etc. So this whatever we have written in box, you need to write in one liner. And done. So any problem with this or pretty straightforward? Straightforward. How do you find present value of cash inflow? How do we find present value at all for that matter? Take the future cash inflows and multiply by the discount factor. If you take the future cash inflows and multiply by the discount factor, you automatically get the present value of cash flows. Done now. Outflow will anyway happen at year 0. Outflow anyway will happen at year 0. Year 0 means future or now. So outflow is already on which platform? Present value platform. So outflow ka present value, though we have written in the formula present value of cash outflow, we don't have to find this because outflow is already on present value platform. All we need to express is inflows, you first get it on the present value platform. How do you get that? Take the future cash flow and multiply by the discount factor. That's what I wrote here in cash flow column if you just check. This is your future cash flow, multiply discount factor and you will get present value of cash inflows. Done now? Okay. That's about this. Next, profit and how do you find discount factor, people? What's the formula? 1 divided by 1 plus I whole power n. I for interest rate, okay, which will be given to you in the question, n for number of years. Okay. And this discount factor is always after tax cost of capital. They will give it to you in the question. Okay. That you just need to take that. Next is PI. PI means profitability index. Another name, present value index. Another name, desirability factor. This is just an extension of NPV. How did you find NPV? Present value of cash inflow minus present value of cash outflow. What you subtracted, here you divide. Because index, no. Index we express as a numerator divide. It's like a ratio. How do you find ratio? Numerator upon denominator. So how do you get profitability index? Present value of cash inflow divided by present value of cash outflow. Done now. Now let's say inflow ka present value is 1 lakh, outflow ka present value is 50,000. What are you getting? 2. Right? When you do this, you're going to get 2. So what's the decision rule over here is, if profitability index is greater than or equal to 1, then you can accept the project. If that index is lesser than 1, then reject the project. This is a decision rule based on profitability index. Okay. So this is just a pure extension. Nothing new in this case. Can we move forward to the other one? Yes, people. Next is IRR. IRR you already experts. You know. IRR ka full form? Internal rate of return. Another way, they also sometimes call it as implicit rate of return also. So IRR is basically a rate at which present value of cash inflow will be equal to present value of cash outflow. If inflow ka present value, outflow ka present value, if it is same, means obviously NPV will be 0. That's the reason we say IRR is a rate at which your NPV is 0. And IRR ka interpolation formula same. Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower rate. You assume 2 rates and accordingly do the question. Fine now, people. But be careful. Sometimes question only will give you rates. They will give you 5%, 7%, 9%. Discount factor they will only give. If question gives any rates, take that only. You don't assume. When question gives the rate, because no IRR ka answer will keep differing based on the assumption. If you take 10 and 12 and solve, you will get one IRR. If you take 15 and 20, you will get a different IRR. Every student will make same assumption or different assumption. Different assumption you can make and everyone's answers are right. So it will become difficult for the invigilator to find. Hence usually what ICAI does is, for IRR they will only give the rate. They will only give the rate somewhere in some corner of the question. In that case, you cannot assume. You have to take the same rate. If they don't give, you are free to assume whatever rate you want. Otherwise, watch out, take the rate and solve. Otherwise, you will not get marks. Fine, now people. And one more thing is decimal. Sir, if the question gives the decimal factor in 3, then you will exactly take how many decimals? 3. If they give 4, you will take 4. If they don't mention anything about decimal, then you are free to take 2 decimals, 3 or 4, your choice. But usually in ICA ka majority solution, if you just check how many decimals they take, 3 decimals is what ICA is following as a standard. In some problem, they will also take 2 and 4 also, but majorly they take 3. So if you want, you can follow the same for your examination. Done. Can we move on to the next one? Next is MIRR. MIRR means Modified Internal Rate of Return. What is this concept is? Now look at this. I've given a small example. If required, if you have understood this particular example, I'll not take up a question. Otherwise, we'll do one question on MIRR. So check. Cash outflow at year 0 assumed how much? 20,000. Discount factor is how much? 10%. Now people, let's say the project ka life is 4 years. Project ka life is 4 years. 4 years may you get this much cash inflows every year. First year how much? 10, then 15, 12 and 20. This is given to you in the question. Done now. But now IRR and all is a non-discounting technique or a discounting technique. So this 10,000 when we will receive? Not now. You will receive. When we write 1 in FM, it means end of first year. When we say 2, it means end of second year. So this 10,000 company will recover at the end of first year. This 15,000 company will recover at the end of second year. That means all these are present value or future value? Future value. But we need present value. How do we get present value? Multiply by the discount factor. Correct? Okay. Now what MIRR is trying to say is, check this. When did you get this 10,000? End of first year. Project will end at first year or it will go till 4th year? Project will go until 4th year. Now what MIRR assumption is? Sir, when you get a cash inflow in first year, will anybody keep that money idle or reinvest? Reinvest. If it's a profitable project, then will we keep this money idle or reinvest into project only? Reinvest into project. Now this 10,000, when did we get? End of first year. Project will run up till 4 years. That means this money of 10,000, how many years can we invest? You got it at the end of first year. Project gets over at the end of 4th year. 1 year is already over. Count how many years project remaining. 2 years, second year, third year and 4th year. I mean this 10,000 we can invest for how many more years? 3 years. That means will the value really be 10,000 or it will be something else? Sir, if you invest 10,000 rupees for 3 years, will the value be 10 only or it will be more? More. Fine, huh? Okay, so how do we find that? Very simple. How much is your discount factor? 10%. This 10,000 you can invest for how many more years? 3 more years. So that means what will be the value of this 10,000 by the end of 4th year? You'll get a return of how much on this 10,000? How much return you'll get? 10%. So how many years can you invest? 3 years. If it's confusing, very simple. Suppose you made a fixed deposit in a bank. How much money? 10,000. What is the term? 3 years. Bank is offering how much return? 10%. After 3 years, what will be its value? How will you do that? Take 10,000 and add 10% 3 times. Yes, no? So that means what is the value? 13,300. Do your calculator. 10,000 plus 10% plus 10% plus 10% you do. How much are you getting? 13,300. That will be the value. Any problem? Are we good with this so far? Fine. Like this you can directly get. You can do this directly or you can use that mathematic formula. Remember, currently the value is how much? 10,000. We need that current value or value after 3 years? After 3 years. I mean this becomes present value. We need value after 3 years means we need future value. How do we get future value? Present value into 1 plus I whole power n. To get present value, we take future value and divide and multiply by discount factor. How do you get discount factor? 1 divided by 1 plus I whole power n. Now, if you know this, can't you find out future value? How do we find future value? Send this to the other side. So it will become what? Present value into 1 plus I whole power n. Yes, no? This, ICA calls it as reinvestment factor. This ICA calls it as Reinvestment factor. What is I here? 10%. Now calculate that also if you want. 1 plus I whole power n. I is what here? 10%. So 1 plus 0.1. This 10,000 you can invest for how many years? 3 years. So n becomes what? 3. So 1.1 into 1.1, you press and again press equals to button. You should be able to see 1.331. Getting it out. Now take this and multiply reinvestment factor. You will automatically get the same answer. 13,300. Okay, people. That's how ICA presents. They don't use the simple approach. It's very simple, no? Right? But ICA in MIRR question, they will take the cash inflow. They will have one more column called what? Reinvestment factor, and then get terminal cash flow. Terminal cash flow means what is the value at the end of the project. Here in my example, project is ending in 4th year. Done now. Can we try both the methods for next one? Check. Now this 15,000, when did we get? End of 2nd year. This 15,000 we got it at the end of 2nd year. Yes, sir, people. Now, how many years can you invest this 15,000 now? You got this at the end of 2 years. 2 years is already over. Project will end at the end of 4th year. So how many years can you invest? 2 more years. So how much will be the value? 15,000 plus 10%. You will add it once or twice. So 15,000 plus 10% plus 10%. How much? 18,150. This is a simple method. ICA method is what? Reinvestment factor. How do you get reinvestment factor? 1 plus I whole power n. I is 10%. N for how many years can you reinvest this money? 2 years. So here n will become 2. 1.1 into 1.1. How much? 1.21. So take 15,000 into 1.21 you do. You'll automatically get 18,150. That's another way. Presentation is your call. Okay, Naji. And now same thing. This 12,000 when did you get? End of 3rd year. So how many years can you reinvest this? 1 more year. That means how much return you will get? 10%. So 12,000 plus 10% you do. How much is that? 13,200. Our reinvestment formula is 1 plus I whole power n. N is here what? 1. So 1.1, that's all it is. And then we can't do it. 1.1. So 12,000 into 1.1 will become how much? 13,200. Last year, 4th year, 20,000. You got this 20,000 at the end of 4th year. And project ends at the end of 4th year. So can you reinvest this or you can't? That means its value will, don't write 0. It's you get this at 20,000 means its value is what? 20,000 only. Done, people. That means all these are value now or at the end of 4th year. At the end of 4th year. Why 4th year? Because in my example, project is ending at 4th year. That we call it as terminal cash flow, or simply we can call it as TCF. Done, people. So add all of this. How much is this? 64,650. Done now. Everybody good? Now what MIRR is trying to calculate is, what MIRR, first maybe you tell me, what is IRR trying to calculate? Then I'll tell you MIRR. What is IRR trying to calculate? At what rate? IRR is trying to calculate at what rate present value of cash inflow and present value of cash outflow both are same. At what rate present value of cash inflow and present value of cash outflow will be same, right? What MIRR is trying to calculate is at what rate present value of terminal cash flow will be equal to present value of cash outflow. At what rate present value of terminal cash flow will be equal to present value of cash outflow. That's the distinction between IRR and MIRR. MIRR basically considers one element, that is reinvestment element. Whatever cash inflow you will get every year, nobody will keep it idle. People will reinvest that money. So hence, at what rate terminal cash flow will be equal to present value of cash outflow is what MIRR is trying to calculate. Easy na sarji? Pakka na? Now, IRR, MIRR calculation is same. The only extra fitting you need for MIRR is what, sir? Terminal cash flow. After this step is a ditto. You know this. Tell me, how do you calculate IRR? What are the columns you need? Year, cash flow, discount factor, 1 rate or 2 rates. Maybe first we can take it at 10%. Then present value of cash flow. 1 rate we have to assume or 2 rates. Okay. Now if you want quickly. Now you don't need to copy this. So. Now year 0. Year 0. Now this terminal cash flow, will get it now or at the end of the project? End of the project. That means end of the project is year 4. How much did you invest to start this project? 20,000. So 20,000 outflow will happen later or now? Inflow or outflow? Outflow. Now this terminal cash flow is an outflow, or we will get this. This 64,650 is an outflow, or we will get this. Don't forget, all these are cash inflow. We reinvested this, and what is its total value? 64,650. So 64,650 is outflow or inflow? Inflow. Yes, sir. At what rate these two will become same? That is what we are trying to calculate. Okay, na? So since we have assumed at 10%, tell me at year 0 discount factor is 1. At 10%, give me 4th year ka PVAF or PVIF? Sir, you will not get 64,650 every year. You will get it once. That to which year? 4th year. That means we have to use PVIF. How do you get PVIF? 1 divided by 1.1, press equals to button 4 times. How much is that? 0.9090, 0.82647513 and 0.6830. Na? 0.6830. That is a 10%. You can mug it up. It's okay. It will come in many problems. Okay. 0.6830. Done. Now, how do you get present value? Multiply. 20,000 into 1 will be 20,000. These two multiplication, how much? 44, 156. So, correct. Matching. Now, what is your NPV now? What is your NPV? These two, if you do, you will get 24, 156. Positive. So, that means is 10% my MIRR. No. If 10% was MIRR, means this value should have become 0. Is it 0? No. That means we have to do what now? Assume one more discount factor. Number looks a little big. So, can I assume maybe 18% and test it out, let's say? Okay, let's assume 18%. At year 0, 18% ka discount factor is 1. For year 0, at any rate, discount factor is already 1 because we are already on present value platform. Now tell me at 18%, 4th year ka discount factor. 1 divided by 1.18 equals to button 4 times. 5158. Now find out the present value of cash flow for me. Take this and multiply by the cash flow. No, this is 20,000 negative, and this is what? 33. Oh, that means still we need more. Okay, 1 minute. Hang on then. I think this is a bad example I took. I should have taken a better example. Okay, people, let's try it at maybe 25%. Let's try. Maybe take 30 better. But you're getting it now. Now on the step is same as IRR. No change. But anyway, since we've started, at least we'll complete. Okay, let's maybe take 30%. 1 divided by 1.3. Press equals to button 4 times. How much is that? 0.3501. Then present value of cash flow. This is 20,000 negative. Oh, these two will be. Oh, you're still 40 much. It's 40 guru. 40. Changed. 40. 35 is okay. Now again, if you get negative problem, we'll take 40. No issues. 1 divided by 1.4. Press equals to button 4 times. 2603. Present value of cash flow. How much are you going to get, people? Present value of cash flow. This is negative 20,000. This is 16,828. Finally, we got a negative number. Okay. How much is that? 3,171. Now plug in your normal IRR formula, which is what? Lower rate. What is the lower rate? 10%. But NPV at lower rate is 24,156 divided by NPV at lower rate minus NPV at higher rate. Higher rate ka NPV is already negative. Negative of negative will become positive into higher rate minus lower rate. 40 minus 10. When you solve, you will get an answer. That is only your MI. Okay, Naji. This step ditto as IRR. Absolutely no change. The only thing is you need to first find for MIRR terminal cash flow. Consider the reinvestment factor and get the terminal cash flow. You have the answer. You have solved. You're doing taka taka taka. If you solved means tell. 36.5%. Usually it will not be that high and all, but just say fine. Done. So everybody understood MIRR? You want me to take you through one more problem or not required? This is fine. Just walk me through the process again. What is this? MIRR is modified internal rate of return. So here in this problem, what they'll do? They will give you cash inflow. Should we take cash inflow or get first terminal cash flow? Terminal cash flow. How do you get terminal cash flow? Whatever cash inflow you will get, you have to consider the reinvestment. How many years more can you reinvest that? Check. Either you can use reinvestment factor wala ICA approach or simply add the discount factor. By doing all this, totally you will get terminal cash flow. MIRR is basically at what rate present value of cash outflow will be equal to present value of terminal cash flow. At what rate these two will become zero. That only will be MIRR. After this, ditto step as IRR, no change. Okay. MIRR also you are saying it's sorted. I'll move forward then. Okay. Next, discounted payback period. People, we already calculated payback period. What does payback period mean? In how many months or in how many years we will recover our initial investment. Now, one of the drawback of payback period or ARR is they consider time value money or ignore. That particular disadvantage has been sorted out by which method? Discounted payback period. Name itself is saying discounted payback period. Now, for payback period, what did you use? You use present value of cash inflow or just cash inflow? Just cash inflow. And did the payback period calculation. In discounted payback period, will you take cash inflow and calculate payback period or present value of cash inflow? For discounted payback period, take the present value of cash inflow and do the same calculation as you did for payback period. Okay, no? Not cash inflow, but present value of cash inflow. How do you find present value of cash inflow? Take the cash inflow and multiply by the discount factor. You will get the present value of cash inflow. Now you do present value of cash inflow will not be same every year. That means in discounted payback period, you can't use formula. You always have to use what approach? Cumulative approach. Because every year ka discount factor will change, no? So every year ka present value of cash inflow also will change. Hence compulsorily you'll have to do what? Cumulative approach. But any difference after this, any difference between discounted payback period or steps are same? Steps are same. Correct, people? What is that formula we discussed? Lower rate. If payback period is between 6 to 7 years, what you will do? Take the lower rate, which is 6 plus required cash flow divided by actual cash. That is the same. So I don't think so you need any problem for this, no? Manageable, I'm thinking. Same step. Okay, we'll move forward to the next one. Next to a few more aspect and then we are done. Or maybe one more. I think it's there over here. I'll come to that. Capital budgeting under capital rationing. Just a minute. Capital budgeting under capital rationing. These are some special cases. What is this is? Sir, suppose company has 1 lakh money. Company has how much money? 1 lakh money and they want to start a new project. They want to take up some new project. They have finalized 3 projects. Company feels they can take up how many projects? 3. But to take up project A, how much money is required? 50. We have 50 or we have 1 lakh. So that means any fund shortage or we have enough money. For B, how much you need? 40. For C, how much you need? 25. Sir, if you want to do, company now is confused which all project to take. They don't want to take one. They want to take multiple. If possible, everything. Okay. Now, how much money is available with the company? Maximum money available is only 1 lakh. If company wants to take all the 3, how much money is required? Add this. If company wants to take up all the 3, money required is 115. Yes, but is 1,15,000 available with the company or only 1 lakh? 1 lakh. So we can't take up all the 3. Maybe we can take up only 2, right? Now how to choose? How to choose? Now 1 second. They will give you in this problem, they will give you data. Check. A ka investment 50, B ka this will be given. This is the year 0 ka cash outflow. NPV also, let's say they have given in the question. What is A ka NPV? 15,400. B ka assume 18,700. C ka 10,100. Sir, NPV is a benefit. NPV is a benefit. Now you tell me if there are multiple projects, if there are NPV ka decision rule is if there is only one project, if there is only one project, if NPV is greater than or equal to 0, then accept that project. NPV is lesser than 0 means, meaning if NPV is negative means reject. That's a decision rule for multiple project or single project. Single project. If you have multiple projects, what is the decision rule? Select that project with a lower NPV or higher NPV. Higher or rather highest NPV. Yes, no. Now you check among all these 3, which is the highest NPV? 18,700, which is what? B. And next will be A. Next will be C. Yes, no. Correct. That is right. That is also right. But one thing what this particular special case teaches us is, yes, NPV may be highest for B, but all the projects have same investment or different investment. So what this particular case is, and you don't want to select one project, we want to select multiple, but we have a fund shortage. So we'll have to now decide which all projects should we take. So now what it says is, straight away don't decide based on NPV, because investment is same for everything or different. First, try to get them on one platform for comparison purpose. Now all the outflow is on same platform or different platform. Outflow is different. Hence, what do we do over here is get everything on some single platform. You can get it on 1 rupee platform, 10 rupee platform, 100 rupee platform, your choice. First, get everything on a same platform for comparison purpose. Usually in an examination, we get everything to what platform? 1 rupee investment wala platform. What is this? Is very simple. Now check. How much is A ka investment? 50,000. If you invest 50,000 in A, how much NPV you will get? 15,400. So it's a simple proration. For project A, 50,000 if you invest means how much NPV you will get? 15,400. Now I'm getting everything on 50,000 platform or 1 rupee platform. If 1 rupee is the investment means how much NPV? If 50,000 is investment means NPV is 15,400. If 1 rupee is investment means how much NPV? Calculate X for me. How do you get X here? Cross multiplication. How much is that? 15,400 divided by 50,000. Correct, Aji? So that means what is the formula for this? 15,400 is what? NPV. 50,000 is what? Outflow. That means if you want to express in one line of formula, it will be NPV divided by investment. NPV, where it went? Here. NPV divided by initial investment. So if you do that, how much did you get? 0.308. Done, people? First try to do this. Okay, if you forget the formula, you can build your formula using this particular cross multiplication. Okay, but simple way is formula. What is that? NPV divided by initial investment. That you calculate for every project. So 15,400 divided by 50,000 is 0.308. Calculate for B also. 18,700 divided by 40,000. How much? 0.47. 10,100 divided by 25,000. How much? 0.4. Correct? Now you tell me, this is the NPV for a different platform or everything on a single platform? Everything we have bought to a common platform. What common is that? 1 rupee investment wala platform. Now what you have to do is you have to assign ranks. You need to assign ranks. Now check. If you invest 1 rupee in project A, how much NPV it gives? 30 paisa. Same 1 rupee if you invest in project B, how much NPV it gives? 47 paisa. Same 1 rupee investment if you invest in project C, how much are you going to get? 40 paisa. Now everything is on common platform. For 1 rupee investment, which is giving highest NPV? For 1 rupee investment, which is giving highest NPV? B. So first rank goes to B. For 1 rupee investment, whichever project gives the highest NPV, you assign first rank to that. Done now. Once more, got it? Got it. Next highest NPV is there after 0.47, which is the next highest number. 0.4, that is which project? C. So second rank will be given to C. Last rank will be given to A. That means what is the selection order? First you will select B. If still fund is there, you will select C. If still fund is there, then you will go for A. That's the selection order. Done now. Now let's see. To do B, how much money you need? If budget is 1 lakh, how will you do the selection? First you will select which project? For B you will select. To do B, how much money you need? 40,000. And how much NPV totally B will generate? 18,700. Money exhausted or still it is there? Money is still there. How much money you still have? You still have money. Next you will go for which second rank project is what? C. C requires how much investment? 25. How much total NPV C gives? 10,100. So totally how much money you have utilized? 65. How much you have? You totally have 1 lakh. 65 utilized means balancing figure is how much? Still 35,000 is there. But to do A, how much you need? 50,000. Okay, now the question will use one terminology. Based on that, our next point will vary. In these problems, sometimes they will say projects are divisible. They will say what? Projects are divisible. if they say projects are divisible, what it means is you don't have to do the project fully. You can do it partly also. When the projects are divisible. Now, if they say projects are divisible, I mean, should we reject A or we can accept A? We can accept A, but do we have money to execute project A 100%? No, to do project A, we need totally how much money? 50, but we have 50 or we only have 35? We only have 35. If the question says projects are divisible, A also we will take up, but will not be able to complete it because we are investing only how much? 35,000. Sorted out. Correct? And now NPV don't write 15,400. Prabhu. 15,400 NPV you will get provided you invest how much? 50,000. Are you investing 50 now or only 35,000? So you have to do proportionate. 15,400. This number is a NPV. If you invest 50,000, but are you investing 50,000 or only 35? Only 35 if you invest means how much NPV you will get? 10,700. Like that. Done now. Any problem? This is a selection rule. Usually in the question they say projects are divisible. If they say projects are not divisible, then A, cut it off. You will only be able to do B and C. That wala combo. Done now, people. This scenario is a special case. We call it as what? Capital budgeting under capital rationing. You will apply this. You will do this 1 rupee investment only if the question specifies. Otherwise, no need to do this capital budgeting and under rationing wala case. Only if question specifies. Done na, sir? Need a minute to process or carry on? Any problem? Last bench? You want me to zoom in on anything? You're looking at me, I'm looking at you. So what do we do? Yeah, proceed. Done. All right. Next, people. Break at 10:30. Okay, no? I think as informed yesterday. Okay, no? Lunch break, we will see. No lunch break means 2:30, I will leave. With lunch break means 1 hour extension. You decide. And at 1 o'clock, I will ask you once again. That time you tell me how you want to go about it. Okay. For now, let's not worry about that and take too much pressure. Yeah. Now, can we go for next special case? The next special case is, sir, if let's say there are two projects, or maybe let's take up this only. Where is that? Here. Let's say people, company has to choose between X and Y. They can't do both. Company wants to select only one. Either X or Y. Both ka initial investment is what? Same. Both ka initial investment is same. NPV here X ka 15, Y ka 19. Okay. That means now if I stop here, what will be the decision rule? You'll select Y or X. Among multiple projects, what is the decision rule? You'll select the project with a lower NPV or higher NPV. This is 15 NPV, this is 19. So obviously the selection will become Y. Correct? But hang on, they'll give you one more data over here. Useful life of X is only 4 years. Y ka is 5 years. So life is same or different? So it's common sense, no? If you run the project for a longer duration, you will get same benefit or higher benefit? Higher benefit. The longer the project is, the benefit will also be on the higher side. So here, taking the decision only based on NPV is correct? No, because is life same or unequal life? So unequal life. So this is a special case where the life is unequal. Here there are a couple of methods, replacement chain model and EAC. Replacement chain model, we will not use it for exam, leave that. There is a technique called what, people? EAC. We will take care of that. We will not decide based on NPV, we will decide based on EAC. What is that? Is very simple, no? Sir, this is this is a total benefit. Do you agree with me? NPV is the benefit on what? For 1 year level or total level? Total project ka, this is the benefit. Okay. But is the life same or different? Different. Hence, what we do over here is get the average benefit. Get the average benefit. Whichever project has the highest average benefit, select that. This is the total benefit, right? But since life is different, first try to get the average benefit of both the project, and whichever project gives the highest average benefit, select that. Done now. Now, how do you find normally average? How do you find average? Total divided by number of years. What is a total NPV? NPV is benefit only, no? What is total benefit? 15 lakh. What is a total life? 4 years. So 15 lakh by 4 you do. You're getting some number. Then 19 lakh divided by 5 you do. You're getting some number. Done now. Is that appropriate way to do it? When you did ARR considered time value money or ignored? Ignored. Hence, there we use simple average. But NPV ignores time value money or considers? Considers. And every year ka discount factor. Sir, if the life of the project is 4 years, means all the 4 year ka discount factor same or different? Different. Means here using simple average is not appropriate. Because each year ka discount factor is different. Everyone okay? So here we can't use simple average. We have to use weighted average. Understood the logic? Correct? Now how to do it? Very simple. You'll have to give weightage based on the discount factor. Now let's say discount factor is 10%. Discount factor is 10%. First give me PVAF. PVAF at what rate? 10%. For this project ka life, which is 4 years. Calculate PVAF for me. Present value annuity factor. How do you calculate that? 1 divided by 1.1. Press equals to button 4 times and then press GT button in your calculator. Grand total button. How much is that? 3.169. Now don't copy the same here, Prabhu. This ka life is how much? 5 years. Now give me PVAF at 10% for 5 years. 1 divided by 1.1. Press equals to button 5 times and GT button. 3.790. Now you tell me, this ignores time value money or this itself is time value money? Considering time value only, you get this number, no? So this becomes your basis number to find out weighted average. Now how do you find that average NPVs? Take the NPV and divide by PVAF. Take the NPV and divide by PVAF. Both the case, you do it for me. How much are you getting? For X, how much are you getting? 15 lakh divided by 3.1698. That's what I've written here. NPV divided by PVAF. 4 lakh 73, 216. 19 lakh divided by 3.7907. 5 lakh 1,227. What is this number? This is your average NPV, ignoring time value money. Consider. Now you do the selection based on this. This is a benefit. So you will select the one with a lower average benefit or higher average benefit. Higher. Which is the highest among these two? Plan Y. I mean, therefore, what is the selection rule? Select Y as it has the highest EAC. Done. We can't use simple average because NPV considers time value. Or if you don't want all this logic wala drama, simple one formula. How do you get EAC? NPV divided by PVAF. NPV divided by PVAF. Do that, do the selection rule. That's all as a formula. I think this also we have got all this data, they will give it to you in the question. I don't think so we need any question for this. This example itself is good enough, no? We've learned. Now they will put more blade in question. X limited or Y limited or they'll put some 8 to 10 lines they'll put, but the drama is this only. I've only taken numbers and solved. Good enough, no? Okay. Story they will put, correct. Now people, but do keep in mind, don't mug it up. Don't mug it up literally. Because in some problem, they will not give NPV. They will not give you NPV. They will only give you cost. They will only give you cost. Right? Both the problem we have done in our regular class. Here now check, I'll take you through one more example. Now again, company has to decide whether to buy machinery A or machinery B. A will cost, A ka running cost is how many years? A ka life is 4 years, B ka 5 years. A you can use it for 4, B you can use it for 5. Life same or different? Unequal life. Now A will cost how much to buy? Present value of cash outflow. A will cost how much? 10 lakh. B will cost how much? 11 lakh. In fact, they will not give you this. And how they will structure this question is, maybe I'll just quickly tell you and then probably do it. People, they will give you in these problems A ka multiple cost and B ka multiple cost. Like what are those multiple costs? Now let's say they will say A ka year 0 cash outflow is let's say 5 lakh. B ka let's say also 5 lakhs. That means A and B is costing different or same amount? Same amount. If you want to buy an A and B, both will cost, it could be same, it could be different, doesn't matter. Okay, I've just taken same for simplicity. Then they will say running cost per annum. They will say what? Running cost per annum. For A, it is 1 lakh. For B, it is 1.2 lakh. Possible. Or they will give you different running cost. What is the life of A? 4 years. What is life of B? 5 years. They may give you same running cost every year, or it may be different. Okay, people. Now, how did you calculate ESC previously? Tell me, what is that formula? NPV divided by PVA. To get NPV, we need two data. To calculate NPV, we need two data. What is that? We need cash inflow as well as we need cash outflow. Now, you check this question. Do we have benefit data over here? This is outflow. Running cost means maintenance expenditure. That is an inflow or outflow again. Right? That means in this problem, can you calculate NPV or only cost is given? Cost is given. Right? Now, straight away, don't add and say 6 lakh. Hey, no. This is 1 lakh rupees every year. Right? This is a running cost per annum. Right? So, hence, and this 5 lakh rupees you have to incur now. This 1 lakh you'll incur now or every year. Every year. That means this is on which platform? Future value. This is on which platform? Present value. Straight away we can add. No, you need to first find what? Present value of this. You need to first find present value of this. This is already on what platform? Present. So, when you find both ka present value, then you will get what, sir? Total present value of cash outflow. That I've assumed it to be 10 and 11 here. Everybody good? This usually will not be given to us. We need to find. Understood, everybody? Everybody good? Is this NPV or outflow only? Outflow. But is inflow ka data given or missing? Missing. That means here you'll take the decision not based on benefit. You'll take the decision based on cost. Which cost? Total cost or average cost? Average cost. That only again we are calling it as what? EAC. But here EAC is not average benefit. Here EAC is average cost. Now tell me the formula. There the formula was NPV divided by PVAF. Here NPV na present value of cash outflow na. Present value of cash outflow divided by PVA. Done na, Sirji? Everybody good. And how much you're getting it as? See, 10 lakh divided by PVAF if you do. Here you will get 3 lakh 16,000. These two ka division if you do, you will get 2 lakh 90,237. Any problem? Now tell me the decision rule. You will select the one with the highest EAC or the lowest EAC. This is not the benefit side. This is the cost angle. From the cost, if you are making the decision, you will select the one with the lowest average EAC. Which is the lowest number? Machinery B. So therefore, selection rule is this. Done now. So just because it is EAC, don't select the one which is highest. First check, have they given NPV or have they given cost? If it is benefit angle, then you will select the one with the highest EAC. If you are working from cost angle, you will select the one with the lowest EAC. That's the thing. Manageable now, people. Work. Next, some decision rule. This came as a theory in your current RTPs. What is a decision rule for individual project as well as multiple project? Now, first people, payback period. Payback period. Payback period meaning is what? In how many months or years we will recover our initial investment. We want this recovery to happen as long as possible or as soon as possible. I mean, if there is a single project, if they have multiple project means you'll select the project with the highest payback period or the lowest. But if you have a single project means, then you will have that individual cutoff. Like now you will have individual target. No, I want to clear CA in first attempt too. Someone may say I want to clear CA within 3 attempts. So possible. No? Yeah, I hope nobody has that target. Yeah, just saying, right? Same way, company also will have a target in how many months or in how many years they want to recover their initial investment. Now, let's say one company, people, they have a rule that they want to recover initial investment within 3 years. Within how many years? 3 years. A particular project ka payback period is 4 years. Now, you tell me this project will be accepted or rejected? What is company ka rule? They want to select that project where initial investment can be recovered within 3 years. This is any data or internal deadline? Company ka internal deadline. How much is that? 3 years. But one particular project ka payback period is how many years? 4 years. So this project will get accepted or rejected? Rejected. Why? It has crossed our internal deadline. That's what I've written over here. If individual project if you are doing a payback period means that project ka payback period should be lower than expected period. Expected period means deadline. If it is lower than our deadline, accept. If it is equal to our deadline, accept. If it is crossing our deadline, reject. That's your individual project ka payback period. Any problem? No. Now ARR. ARR ka full form, people tell me. Average rate of return. Return. Last word, return. It's a return. Return means cost or benefit. So if you have multiple projects, you will select the project with the lowest ARR or highest ARR. Since ARR is a return, you want to select that project with the highest ARR. If you have only one project, let's say project ka ARR is 12%, accept or reject. You have only one project. Project ka ARR you calculated. How much did you get? 12%. Accept or reject? We need to check. So remember, for individual project payback, we had one internal deadline. Same like that, you need to check one internal expected return. Let's say company, whenever they do a project, they expect minimum 15% return. What is company ka expectation? 15%. From every project, they'll expect how much return? 15%. But this project is giving how much? 12. That means accept or reject? Reject. Why? It is lower than expected. Fine. Suppose ARR is 17%. Then accept. So that's what I've written here. If it's individual project, the return should be higher than expected return. Expected return means our internal deadline. If it is equal to or greater than our internal deadline, accept. If it is lesser than our deadline, reject. NPV decision rule you already know. If you have single project, what is the decision rule? If NPV is greater than or equal to 0, accept. If it is lesser than 0, reject. If you have multiple projects, you will select the one with the lowest NPV or highest. Profitability index also same. What is the decision rule? Individual project profitability index should be greater than or equal to 1. If it is lesser than 1, reject. If you have multiple projects, what is the decision rule? Select the one with the highest profitability index. IRR also same. Sir, IRR again full form is what? Internal rate of return. So if you have multiple projects, you will select the one with the lowest IRR or highest. IRR is also a return. So you'll select the one with highest IRR. But if you have only one project, what is the decision rule is? Now let's say people, IRR of one project is, let's say 15%. IRR of a particular project is 15%. To do this project, company will have to borrow money. Every project needs investment. You can raise that money through equity shares or retained earnings or preference shares or debt. If you have multiple sources, if you have used, means then we calculate what? KO. KO is overall cost of capital. Let's say overall cost of capital is 11%. Now you tell me, reject or accept? What is the decision rule? Reject or accept? Sir, you're doing a particular project where IRR expected to be 15%. But to do that project, how much cost you're incurring? 11%. That means IRR is a return. Return is lesser than cost or return is greater than cost. That means in this case, the decision rule will be accept. If it's other way around, IRR is 15%. Let's say KO is 17%. Then accept or reject? Here it will be reject. Because the benefit you are getting is only 15. It is costing how much? 17. So in that case, it will be a reject wala rule. So that's what I've written over here. If IRR is greater than or equal to KO, then accept. If IRR is lesser than KO, then reject the project. That's your decision rule. Over. Almost over. Moana. Last bit to people, or I'll do a thing. I think this one I'll probably explain with the help of a question only. I think maybe better. We may not understand it. If you have attended my class, I would follow the same steps, so you might get it, but newcomers may not get this. So let's do a thing. Let's do one question and come back to this. Fine. Remind me. I'll come back to this chart and show you once again. Can we have a quick recap? What is the chapter name? Investment decisions. The whole drama of this topic is whether to take up a particular project or not to take up. Okay. And these are not simple decisions because the amount of investment will be very huge and the life of this project also will be very high. So it has an impact for a longer duration. Hence we use a technique called capital budgeting techniques. Under capital budgeting, we have many methods. Broadly, if you have to segregate them, it will be discounting technique, or another name, traditional technique, and the other one is rather non-discounting technique or traditional technique. Another one is discounting technique. Under non-discounting technique, we have payback period. Payback period simply means in how many months or in how many years we will recover our initial investment. Payback period is simply given by the formula. You will directly apply formula or check whether annual cash inflow is same or not. If annual cash inflow every year is same, payback period is simply given by the formula initial investment divided by annual cash inflow. You want me to show this chart? You're looking at it. Okay. This is the payback period ka formula. If annual cash inflow is fluctuating every year, then we find cumulative method. Cumulative means every year ka cash flow go on adding and then apply the formula. If payback period is between year 5 to year 6, we'll start with a lower number, which is 5 plus required cash flow divided by actual cash flow. Then payback reciprocal. How do you calculate payback reciprocal? 1 divided by payback period. Okay, next is ARR. Average rate of return, accounting rate of return or book value rate of return. ARR is simply given by the formula average PAT divided by initial investment or average PAT divided by average investment. How do you find average profit? Add all the years ka profit divided by number of years. If they don't give you profit, if they give cash inflow data and cash outflow data, can you find average PAT? Yeah. Total of all the cash inflows. Total of cash, add all the years ka cash inflow. Deduct all the years ka cash outflow. Outflow will only happen at year 0. So inflow you will treat it as an income. Outflow you will treat it as an expense. From total income, if you reduce total expense, you will get total profit. We don't need total profit. We need average profit. So hence what do you do? Divided by n you'll have to do, number of years. That way you'll get average profit. And how do you get average investment? Half of initial investment minus salvage value, close the bracket, add salvage value, add WC, working capital. This will not be there, so it's fine. Okay, next we looked at discounting techniques. First one is NPV. NPV, how do you get? Present value of cash inflow minus present value of cash outflow. Now, decision rule. If NPV is greater than or equal to 0 for individual project, except for multiple projects, whichever project has the highest NPV, select that. Then profitability index. How do you get profitability index? Present value of cash inflow divided by present value of cash outflow. Decision rule for individual project is profitability index should be greater than or equal to 1. Lesser than 1, reject. If you have multiple projects, you will select that project with the highest profitability index. Then IRR. IRR is simply a rate at which present value of cash inflow and present value of cash outflow will be same. Or IRR is a rate at which NPV will become 0. Simply got by interpolation formula, lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate, whole thing multiplied by higher rate minus lower rate. Assume 2 discount factors and do. Before assumption, check the question if question has given any rates. If they have given, take the same. Then MIRR. MIRR ka full form is modified internal rate of return. MIRR is trying to test at what rate present value of terminal cash inflow, at what rate present value of terminal cash inflow will be equal to present value of cash outflow. Here simply what we have to do, whatever cash inflow we have, we'll reinvest and get everything to which platform? Terminal cash flow wala platform. In this problem we got total terminal cash flow 64,750. How much was outflow? 20,000. At what rate these two will be equal? That only we call it as MIR. That wala steps is same. Assume 2 discount factors and use the interpolation formula. Okay, next we looked at capital budgeting under capital rationing. This is a scenario where we have limited money, but we have to select multiple projects. And all the outflow of all the projects same or different? Different. So first get everything on 1 rupee platform. So how do you get this? NPV divided by initial investment. NPV divided by initial investment, if you do, you will get NPV for 1 rupee platform. Then assign the ranks and accordingly do the selection. And check if the project is divisible or not. If it is divisible means part of the project is also acceptable. If it is not divisible means either you have to accept full or reject full. Beach mein part things not acceptable. Next, initial investment same, but project ka life is same or different. If life is different means we have to use which technique? EAC technique. But before you apply EAC, check have they given you only cost data or have they given you NPV data. So first of all, how do you find out EAC? If they give you NPV. If they give you NPV, how do you find? EAC means what? Average. If you are working from NPV angle, when you find EAC, that is average NPV. How do you get that? NPV divided by PVAF, right? And what will be the decision rule here? Since NPV here is given, this EAC will become benefit. You will select the project with the highest EAC, lowest what one? You will select the project with the highest EAC. But suppose if they give you a data of only cost, benefit data not given, they have given you only cost, right? So first find what? Average EAC. How do you get that? Instead of NPV, we will take present value of cash outflow alone in the numerator divided by PVAF. That way you will get your EAC. This EAC is your average cost. Now you will select the project which has the lowest EAC. That's your decision rule. Okay. That's pretty much it. I think decision rule we already touched upon, so it's okay. On this part, remind me after the problem, if it doesn't get covered, once again I'll show it to you. Now can we go through few questions on whatever we have studied? And now your choice. So first one is this is MIRR. You need one more problem on MIRR or not required? You came late, no? He's like, I came later, tell me once again. You watch a recording, macha. We'll publish anyway in YouTube anyway. Others are okay, no? Others who are covered, we need one more question or wastage of time? Because I want to focus on things. Comfortable, no? Manageable. Others are study material question only. So basically, what is MIRR ka platform? Or just tell me one thing. How much investment you are making here? 136. What is this? Year 0 ka outflow. Now here they have given you cash inflow for 1 year or 5 years. Now you tell me this 30,000 when you will get? First year. So this 30,000 you can invest for how many years? 4 years. At what rate? They have given how much rate? 8%. First year ka alone you calculate. Let's see. What is terminal cash flow for 30,000? 30,000 plus 8%. How many times will you add? 4 times you will add. How much you going to get? 40,800. Like everyone got same number. Pakka no? Like this, each amount you go on reinvesting and you will get the total terminal cash flow. Okay, people. Now what you have to do? You're checking. Okay, fine. Done now. At what rate? What is your outflow? 1,36,000. What is your terminal cash flow ka total? 2 lakh. At what rate these two becomes equal? That only is your MIR. Now assume 2 rates and do the things. I think here I've assumed 8 and 11 and done the answer. Fine now, people. So MIR, finally you get the answer as 9.36 over here. If you assume different rate, will the answer be same or it will change? Based on your assumption, answer will change. Okay, now I have given the answer at 8 and 11. That's all over here. Overall satisfied with MIR? Manageable at least. Okay, can we move on? We'll move on then. This one. Remember ARR? Now check. For ARR, we need cash flow or we need PAT? PAT. Now in this problem, we need to calculate ARR. There's only payback period and all is faltu. 1 minute, hang on. I'll just first check the number of questions I have. Okay. All right. 8:30. Because after 10 o'clock you look at me weirdly, no? So, now, or I'll just tell you, sir, payback period. Payback period, you need any questions are manageable. If you check project A ka, every year ka, they have given cash inflow, okay? All these are. Is it different every year or same every year? So, payback period, you can use formula. What formula? Initial investment divided by annual cash inflow. 5,000 divided by 900. That only is payback period. But for project B, is every year ka cash inflow same or different? That means we have to use formula or cumulative approach. Cumulative approach. Same goes for C also. So payback period is easy. NPV, I think if I do it, it will be an insult to your caliber. Yes, no, he's saying yes only, correct. So cost of capital, how much? 10%. Oh, sir, people, this is outflow, this is inflow. But all these inflows are on present value platform or future value. How do you get them on present value platform? Multiply by them, discount factor. Pretty easy again. NPV I don't have to go for. ARR is what I had to discuss once. So for ARR, we don't need cash flows. We need PAT. PAT given a missing. So now you calculate it. Let's see for 2 minutes. How do you calculate? We did explain this. For A, all of you calculate for A. Cash inflow they have given for 10 years. Every year 900. Cash outflows at year 0, 5,000. How do you calculate the average PAT? All of you calculate average PAT. Let's see. If you're getting 400, right answer. Otherwise, no. You're getting 400. Paka. How did you calculate? If they don't give PAT, what is the shortcut way? Take first the total cash inflow. How many years given? 10 years. Every year, how much is cash inflow? 900. 900 into 10 is how much? 9,000. So total cash inflow is 9,000. This is like your income minus cash outflow you do. What is cash outflow? 5,000. So this is like your expense. Total income minus total expense will give you total profit. We don't need total profit. We need average profit. How many years are there? 10 years. So do this, you will get 4. That's all. Clear? Same thing we'll have to do it for project B also, project C also. Clear? Now I don't have to spend time on that. Here it's given. Done. Or maybe for project A, you calculate of ARR for me. Let's see. Project A ka. Project A ka ARR we calculate. What is the average PAT we got? 400. So don't do it under initial investment. I know that is easy. Okay, average ARR ka one formula is average PAT divided by initial investment. How much is initial investment? 5,000. So if you do initial investment, or maybe both, we will put it up here. What is ARR, people? One way is average PAT divided by initial investment. Average PAT is 400. Initial investment for project A is 5,000. How much is this? We want a return. Return is usually we express in percentage. So multiply by 100. 8%. That is using what? Initial investment. Let's calculate using average investment. So calculate. First, how do you get average investment? What is the formula? Half of initial investment minus salvage value plus working capital. Here salvage value not given. What is initial investment? 5,000. Salvage value working capital not given. So effectively you have to do half of initial investment. That's all it is. How much is that? 2,500. Everybody got it now? Only initial investment is given. Salvage value and all not given. So half of 5,000 minus 0, close the bracket, plus salvage value 0, plus working capital also 0. So in average investment, how much are you going to get? 2,500. Average PAT is 400. Average investment is 2,500. So 400 divided by 2,500 into 100. How much are you getting, pa? You are getting 16%. Okay, sir. That's all. Same thing you'll have to do it for B as well as C. These problems are easy, but it can be a little lengthy. They will give for 8 marks. The crux here is not to just solve them, to solve them within 15 to 20 minutes tops. Okay. That's the average. So like if it comes for 10 marker, people roughly for one marks, you need to take 1.8 minutes considering the time we have. So for 10 marks, roughly you have to take 18. If you want, you can stretch up till 20 to 25. Beyond that, though, definitely danger zone. Okay. If you feel you have crossed that, leave the question wherever you are. Leave 1 or 2 pages blank. Move forward to the next question. Don't. Because people, one thing again and again we keep telling, but you guys will probably face this difficulty. In life, no. If you don't know things, very easy. I don't know. Move on. Very simple. Yes, no. But I know the answer to this question. I know each and everything, each comma, each full stop I know. But time is up. Another 5 minutes only I will complete. Just I will take 5 more minutes and I will complete. When that 5 minutes will become 30 minutes, you will not know. So if the time has hit means move on. Right? Than getting 10 on 10 in one question, it is very important to get 50 on 100. Our goal is to get 50 on 100, not 10 on 10 on one question. Keep the higher goal always, right? Completing the paper will increase your chance of clearing the exam, not scoring out in one question. So if time has hit, move on simply. I know it's very difficult, but you need to have that heart from inter-level onwards. I know many of you will face time shortage because paper will be lengthy. At least 2 papers at overall in 6 papers, 2 thought definitely will be lengthy. It is not a mystery. From the time we are writing, everybody is saying the same story. After exam, even we also used to say the same thing. I know, just needed another 20 minutes extra. I could not complete the paper. I only completed for 70 marks, 80 marks, 90 marks. This is the common dialogue CA students give. Okay. So I'm sure many of you will give the same dialogues after exam. But don't worry, it's fine. I've seen people attempting for like 80 and getting 70, 75. Fine. So don't be disheartened. If you write properly, you will get marks. So first focus that, use that 15 minutes very carefully. Read and figure out what order. It's not mandatory to write that first question first only. You can answer in any order. First, you decide your strength, which question you're completely comfortable. Make an order of that and start solving. And first question only, you should be like, you literally think that you're on fire. Daga, daga. You should keep doing like this, full fire. Okay, keep jumping on the chair. Watch out, people. Time to definitely don't ignore. Keep watching every 15 minutes. Make it a point once to see where you're leading, how much you have completed. Make sure at least 80 to 90, that much, so at least you should be able to complete the paper. Lesser than that, quite difficult. Because then we will start freaking out and start writing our own FMO in examination paper. So yeah, so let us not get into that particular mode. So manage the time carefully. This is very important. That you can know only by writing mock papers. 1 or 2 mock papers, if you know, roughly you will know how much time you are taking. Accordingly, you can improve. And don't worry too much about handwriting. As long as we say, no, whatever you are writing, your neighbor should be able to understand. If that is happening, that is sufficient. That much legibility, that much neatness is sufficient. It need not have to be gundu types. You're right. That's enough. Let it not be doctor handwriting also. It should be just visible or legible to your neighbor. As long as, because invigilators also understand. Even they are also CAs, no. They also know how they wrote. So that way and all, they'll put in efforts to at least try to understand what you have written, because people will sympathize with you. Don't worry about that. Yeah. So yes, but do make sure that you improve your writing speed consciously as much as possible. Now this question, Damar then. Damar. Next. EAC you already know, no people. Again, I think I don't have to waste time on EAC wala. But remember, EAC can be on cost angle or on the benefit angle. So that you just watch out to. Then no. On this one, maybe I'll take up. Yeah. This, yeah, it's a good question. It's a usually full-fledged question expected for somewhere between 8 to 10 marks in examination. These types, I mean, not exactly same. If exactly same comes, means I will be full praise to the sky only. Yeah. But it has, you never know. Whichever, every question in study material has come once in exam or the other. Okay, my blessing, my hope is that this question only comes in this attempt. Okay, thank you. I know. If it doesn't come, don't curse much. Okay. All right. Can we move on to the next question? It's a study material question only. If you don't have the question, it's fine. Just listen. HMR is considering replacing a manually operated old machinery with fully automated new machinery. This we call it as replacement decision. Old one you are replacing with new one. Okay, people. Now I told you. What much? Whenever they give you replacement decisions, page number, I don't know. He found it. Awesome. Okay, so it's a study material question only. I'm pretty sure. Now, in replacement decisions, no people, they will give you old machinery ka data and they'll also give you new machinery ka data. One way to do this problem is first to find old machinery ka NPV, then find new machinery ka NPV. That means you are solving the question once or twice. Twice. Then you do the selection. Whichever machinery has highest NPV, select that. That is one approach. But our ICA does not follow that. What we follow, or ICA follows, is incremental approach. They follow what, sir? Incremental approach. My suggestion to you is, since suggested answer will be on incremental approach, if you do on the total approach, what I said now, finding MPV of A separately, B separately, that is total approach. Only your decision will match, right? But suggested answers will be on which approach? Incremental, right? Both are right only. But if they are an FM teacher, they should understand that both are right. Marks should be given. But the people correcting your paper is a CA, but he is not a FM teacher. So your answer, they will compare it with suggested answer. None of them matching. Only decision is matching. 0. Can happen. So as much as possible, let's sync up with ICA. ICA is using what? Incremental approach. So here also we will use what approach? Incremental approach. So what is the incremental, sir? You are making us mental. Very simple. Incremental means extra. Incremental means extra NPV. Ashte. How do you find NPV? For finding NPV, we need cash flow. Cash flow given us, sales given us. So first from sales, we have to arrive cash flow. Walk me through that process. From sales, you reduce all your expenses. They will give you 101 expense, material, labor, dress, doesn't matter. From sales, you reduce all the expense. You will get what? Profit before tax. Reduce tax. You will get profit after tax. Correct? Add back 5 adjustment. First adjustment, depreciation. Then OVAS. OVAS. O for opportunity cost. W, working capital. A for additional capital. S for salary. Yes, sir. Correct. Right? That approach will work for almost every question. Except this question. Or except these type of questions. Why, sir? I'll tell you, sir. Now, people, first I'll tell you the incremental. Incremental approach means we don't want total sales. We want extra sales. Everything on a extra basis. Check here. What is old machinery ka sale? 810. New machinery ka sales? 810. That means how much is extra? Nil. Old ka material cost 180. New ka 126. That means you have to find everything on what basis? Extra basis. Don't take the full number. Take only the extra number. That means you will get total cash flow or extra cash flow. Take the extra cash flow and work out NPV. You will get the extra NPV. If that extra NPV is positive, new machinery accept. Otherwise, reject. That's the rule. So everything here on an extra basis. Clear, Sarji? Okay, na Sarji? Now, yes, whatever we just now discussed cash flow, that is, yes, that's a template which will work for every question. No? But here also it will work. But before that, you need to put some working notes here. What is that? I'll tell you once we do read the questions. 1 or 2 extra working notes here is required. When they are required also, I will tell you. First, let's read the question. But everyone understood now? So what approach are we doing? Incremental. Incremental approach you will only do when they give you old ka data and new asset ka data. Only that case if they give you 2 assets ka data, only in such problems you will go for incremental approach. Otherwise, in all other problem, normal approach. So incremental simply means working out the extra. Everything, every income, every expense, every cash flow has to be on extra basis. Now, let's read the data. Old machinery, they want to replace with new machinery. Fair enough. Old machinery has been fully depreciated for tax purpose. Old machinery has been fully depreciated for tax purpose. That means as per tax, can you claim any more depreciation on this or fully depreciated? First of all, people, when we worked out cash flow problem, right? From sales, you said reduce all expense. That expense will exclude depre or include depre also. Even depreciation you need to reduce. Why? Because depreciation is also an expense, and due to expense, your profit will reduce and your tax also will reduce. That means, can I say on depreciation you get tax benefit? Because due to depreciation is an expense. Due to an expense, profit is reducing. If profit reduces, tax also will reduce, right? So on all your expenses, including depreciation, you get one benefit called what? Tax benefit. To calculate tax benefit, first we reduce depreciation. But is depreciation a cash outflow item or non-cash item? Hence, after paying tax in one of the adjustment, we add back depreciation. That's the logic of adding back later. Now here, check in this problem. On old machinery, can you claim any more depreciation or fully depreciated? It's fully depreciation. So any more tax benefit you will get on old asset or it's fully depreciated? That's a crux. But it has how much book value? 2,40,000. Sir, if it is fully depreciated means it should be 0, no? But they said book value how much? 240. Weird question, no? No. What they've given is right only. Sir, book value means in your accounts. Book value means accounts. In accounts, we have studied accounting standard 10 talks about property, plant and equipment or fixed asset. In your accounts or in our accounting standard 10, there is no depreciation rate concept. What accounting standard 10 says is you depreciate the asset based on pattern of economic benefits. Or leave that, now, in accounts, basically there is no depre rate. There is no depreciation rate. But same thing if you compare in Income Tax Act, for every asset they have suggested income tax rate. So in income tax mein there is a depreciation rate for each asset. For in accounts mein there is no depre rate. I mean, do you think accounts ka depre and tax ka depre will match or mismatch? Therefore, accounts ka book value and tax ka book value also will not match. There will be a mismatch. Clear, sir? In this book value, what they have given, no, it's not as per tax, it is as per accounts. But as per tax record, the same book value is 0. Why? It is fully depreciated. Done now. Now, the first question that will come in your mind. People, I am neither in accounts, nor I am in tax. I am in FM. We are in FM. Now, we should consider accounts ka data, na, tax ka data na, for FM subject. We should take, because accounts ka book value 240, tax ka book value 0. Which one should we consider for our FM? Very simple, no? FM is a decision making, right? We take the decision making for decision making purpose. We need cash flow. We need cash flow. We add back, we deduct depreciation initially because we get the tax benefit. The overall aspect of considering depreciation FM is because of the tax benefit. It is because of the tax benefit. Now you tell me, for our FM, accounts ka depreciation is relevant or tax ka? Tax ka. Because we, for our decision making, we are considering, though depreciation is non-cash expense, we are considering only because of the tax benefit. That means the number relevant to us is not accounts, the number relevant to us is the tax. Dana? That's a synopsis. We don't worry what is the book value as per accounts. We don't worry what is the depreciation as per accounts. We want what? What is book value as per tax? What is depreciation as per tax? Depreciation as per tax on old asset, we already know. How much is that? 0. Because it is fully depreciated. If it is fully depreciated, book value as per tax is also 0. So this number, relevant or goli? This is full goli, irrelevant information for our decision. Got it? Pakka na? Yes, sir. The machine has been begun some causing problems. So it cannot fetch more than 30,000 if sold in the market at present. Immediately, if you sell old asset, how much money you will get? 30,000. It will have no realizable value after 10 years. If you still be like, we are Indian, so we will still ujafai, we will still continue for how many more years? So 10 years, then you will get anything after 10 years or 0. Now only if you sell, you will get 30. If you still persist or continue with this asset, after 10 years, value is 0. The company has been offered 1 lakh for the old machine as a trade-in on the new machinery, which has a price of 4.5 lakh. Good deal, no? Now people, if you replace old asset with a new asset, how much will new asset cost? 4.5. It's an exchange system. The vendor is saying, from whom we are buying the asset, he's saying, old machinery, I will not value it at 30, I will value it at 1 lakh. What is new car cost? 450. That means, should we pay 4,50,000 to this vendor or 3.5? In 4.5, 1 lakh he will adjust towards old asset. And we have to pay him balance 3.5 lakh. Are we comfortable? That means, you tell me, will we sell in the market at 30 or we will exchange with vendor only? In market, we are only getting 30, but this vendor is ready to offer 1 lakh. So obviously, if we are in the same mind, we will obviously go with the vendor only. Now, life of the new machinery is how much? 10 years. How much is salvage value? 35,000. Fine. Further, check this. This is the main culprit. Always in bigger problems, check the depreciation method. Check the depreciation method. Company follows what method? Straight line method. But for tax purpose, WDV method is followed. So when they say straight line method, what do they mean? Where? In accounts. In accounts, we are following what method? Straight line. But for tax purpose, we have to follow WDV method. And in tax, each asset will have a rate of depre. How much is rate of depre? 7.5%. Now you tell me, is straight line method the relevant data for us or WDV method? We always have to consider accounts ka data or tax ka data. As far as depreciation is concerned, we want only tax ka data. I mean, straight line method is not relevant to us. What is relevant? WDV method. And what is the depreciation rate? 7.5%. This is the only machinery in the block of asset. Okay. Below is the sales and cost from both the asset they have given. Now, one I'll quickly tell you. Now, people, this particular depreciation method is relevant for our FM ka decision making. What is that is? Maybe if you want 2 minutes quickly, I'll write. If SLM method is followed, no? If I'm talking all about this in where? Tax. As per tax, if you follow SLM method, then tax record says you will calculate depreciation on individual asset basis. On what basis? Individual asset basis. Meaning each asset ka depreciation is calculated separately, provided you follow what method? SLM method. If you follow by chance WDV method, depreciation is not calculated on individual basis. It is calculated on something called block basis. You must have studied this in your tax ka. If you follow WDV method means then depreciation is always on a block. Block means it is not individual. Block means group of assets. Block means group of assets. So you charge depreciation based on the group level, not individual level. For which method? WDV method. Is this clear? That means approach is same or different? Different. Now here you tell me, are we following straight line or WDV now? WDV method. Yes, sir, people. Now how to calculate this? I told you the logic of all this. Now I'll not go too much of logic. I'll discuss the format with you. Even if you don't know the logic, if you just follow that format, it will work for exams. Because not much time, that is the reason. We had spent in fact half an hour to 1 hour only on this with various examples. So now so much time not there. Even if I do it, pointless. We'll focus more on the pointer. Now, first everybody got that in WDV method we calculate depreciation on what basis? Individual or block basis? Block basis. Block means one asset or group of assets. Like if just to maybe tell you one more. Suppose we have two plant and machinery. Plant and machinery 1 and plant and machinery 2. This becomes block number 1. This becomes block number 1. Block means a group of assets which are similar. If you have 10 assets, if you have 10 machineries, if all are similar, then all put together becomes one block. Okay, Naji. Now let's say you have land and building. Is land and building and machinery same asset, same nature or different asset? So if you have a land and building, that becomes block number 2. Like that. Block means a group of assets which have similar characteristics. Clear? That's a simple meaning. Okay. Now, what we have to do over here is before you start the problem, normally in these problems we need cash flows. Before you do the cash flows, whenever they say depreciation method, what you have to do is first working notice you'll have to put up is first find out depreciation base of the old asset. What did I say? I'm discussing a format. It will work in every question. But which? What is the test you will do first? This format what I'm discussing is only for block method. Block method means WDV method and only under incremental approach. If you want to apply this format blindly as a mug up, first you'll ask yourself two questions. What is it? Whether it is incremental approach problem I'm solving and is depreciation charged under WDV method. If it is so, whatever format I'm discussing will hold. Okay, na sirji? And now, first step, what did I say, sir? Calculating depreciation base. Depreciation base means on what value are you calculating depreciation? On what value are we calculating depreciation? First, you calculate depreciation based on old asset, on the existing asset. Sir, this is very easy for me. 0. 0. Agree? Why? Sir, existing asset has been fully depreciated as per tax purpose. Depreciation basis means simply WDV. Simply book value. What is book value as per our tax? As per accounts, it is 240 or something they told. But tax may it is fully depreciated means book value is what? Sir, if book value is 0 means what will be your on book value only you charge depreciation, no? Right? That book value only we call it as what? Depreciation base. So what is the depreciation base for existing asset? 0. Why? Because it is fully depreciated. Any problem? Once more. We'll maybe go a little slow over here. You're looking at me a little weirdly. So we'll go a little slow. Done now. In exam, in regular class, 4-5 problems we have done on the same format. Yeah. But okay, I do understand that you might have forgotten or some new students are there. So it is okay. This sorted out. Now people, incremental approach, don't forget. Incremental means old you have to compare with new and get the extra. Now you tell me I need a depreciation base or I need incremental depreciation base. How do I get incremental depreciation base? For that, existing machinery ka depreciation base, I have to compare it with new machinery ka depreciation base. Only then I will get incremental. Yes, no? So what is working note number 2 then? If first working note was to find out existing machinery ka depre base, second will be new machinery ka depreciation base. Okay, na ji? This is very, very simple. I told in tax, depreciation works on a block basis. Correct? Huh? Now, old asset ka block value is how much? 0. Correct? Huh? Old asset ka block value is 0. Why 0? Fully depreciated. Now I'm calculating old asset ka or depreciation base of new machinery. Depreciation base of new machinery. How you get it is very simple. No? Now people, you have old asset. It has been fully depreciated. If you buy the new asset, one more asset will come to the block. That means block value will be same or block value will increase. So that means you can tell me the formula. What is that? Depreciation base of new machinery. If you want to get it in formula, first take depreciation base of the old machinery. What is old machinery ka WDV? 0. Now you bought a new asset. If you buy new asset, block ka value will be same or block value will increase? Block value will increase. How much did you buy the new machinery for? 4.5 lakh. Take your calculator. What was old machinery ka depre base? Or rather old machinery ka book value? 0. You added new machinery for how much value? 4.5 lakh. Yes, sir. So that means simply what I'm saying, when you buy an asset, block value will increase. At the same time, opposite sentence is also true. What is our opposite sentence? When you sell an asset, block value will reduce. Sir, if you buy an old asset, if you buy a new asset means old one you will keep it or sell it. So new ka asset value if you are adding means old ka sale value we have to add a minus. So hence what is that formula? Tell me in formula now if you want. To get depreciation base of new machinery, what you will do? First take WDV of the existing machinery. Add a new asset ka value. Deduct the sale value of the old asset. Sir, old asset ka sale value you will take 30. Old asset ka, where it went? Old asset ka sale value you will take 30. Now 30 you will get if you sell in the market. Are we selling to the market or this vendor? Vendor is offering how much? 1 lakh. So we have to minus how much? 1 lakh. So how much did you get? 3,50,000. That means as per tax, now you will depreciate on how much value? 3,50,000. That becomes your depreciation base of the new asset. Old asset ka how much was it? 0. New asset ka how much is it? 350. Compared to the old, is your depreciation base more? Old was 0, new is 350. How much extra? 350. That only becomes what? Incremental depreciation base. This you need to find out. Done na sirji? Pakka na sirji? Everything on incremental basis. Don't worry about. Don't forget that. Now you tell me depreciation base means what? On what we will charge depreciation. Right? So on this incremental depreciation base, if you calculate depreciation, will you get depreciation or will you get incremental depreciation? Since this is incremental depre base, on this if you calculate depreciation, you will get incremental depreciation and that's what we want. That's what we want. Now calculate the depreciation in the normal way. But one pain point is, if it is straight line method, every year depre would have been same. Now here, which method depre? WDV. And what is the life for? 10 years. That means now you need to calculate the depreciation for each year separately. Difficult or easy? Easy but lengthy. So what is a maybe 1 or 2 years we'll quickly do. How much is incremental depreciation base? 3,50,000. Simple column. We'll have opening balance, depreciation and closing balance. So how much is the incremental depreciation base? 3,50,000. What is the rate of depreciation as per WDV given in the question? 7.5%. Calculate 1 or 2 quickly for yourself. 350 ka 7.5%. 3,50,000 ka 7.5%. 26,250. From opening balance, if you reduce depreciation, what are you going to get? Closing balance. So these two ka minus this particular value. Correct? First year ka closing will become second year ka opening. Then on this value, calculate 7.5%. You will get depreciation. That's how WDV method works, right? On the opening balance, go on calculating depreciation. And then you will get the closing. Second year ka closing will become third year ka opening. Like this, how many years? 10 years you need to calculate. Done na sirji? Any problem? This is the highlight of this question. After this, very, very simple question. Maybe one more working note. After that, straightforward. Got it? First, maybe give me a quick walkthrough of this question. We are doing all this. This working note, this working note, this working note is only required not for straight line method, only for WDV method. Because only in WDV method, we calculate depreciation on block basis. In straight line method, asset to asset depreciation. So you don't need all this working note. Straight away, you can calculate depreciation normal way and compare. And straight line method mein debris will be same every year also. So it will be one liner working out. Okay. Only under WDV all this drama. So what drama? First drama is what? Since it is old versus new, we need everything on an incremental basis. So basically we need incremental depreciation. But for that, first we need to calculate incremental depreciation base. To calculate incremental depreciation base, we need two things. What are those? Existing debris base and new asset ka debris base. What is existing debris base? 0. Why? Asset is fully depreciated. How, if you buy a new asset, then what will be the depreciation base? A simple formula if you want to calculate. How is that? Calculate the existing WDV. Add the purchase cost. Reduce the sale value. That's a format. You will get what? Depreciation base of the new asset if you buy it. Old ka is 0, new ka is 350. If you compare these two, how much is extra? 350 extra. On this extra depreciation base, if you calculate depreciation, you will automatically get what? Incremental depreciation base. For 1 year or 10 years? 10 years. That's what we have done till here. Clear, Asarji? Pakka na, Asarji? Move on to the next. Okay. Next one is, now people in this question, no, did they give you cash flow or they give you income expense data? Income expense data. Fine. Now they're given for old also, they've given for new also. We need old and new, or we need incremental? Incremental. One approach is, but one good thing over here is, have they given it for each year separately or common? That means indirectly they're telling all this value will change every year or same every year? Same every year. Only one data is changing every year, which is what? Depreciation. Rest all income, rest all expense are same every year. Okay, na sir? So like depreciation, should we have 10 columns here or not required? Not required, because every year data is any which way? Same. Now one way to do it is, everybody, if you want check, from sales, if you reduce all the expense, you will get what? Profit before tax. But before you do that, or maybe if you're smart enough, I think I'll go with this only. Check. Sir, I can't take this data. They have given PBT. They have only given PBT. I can't use this PBT. Why? Main culprit is depreciation. Why? Sir, they gave old asset ka debris 24, new asset ka debris 41. New asset I will not bother. Old asset they have given 24. No, that is freaking me. Why? Why? Sir, old asset ka, it's fully depreciated. Old asset, they clearly told it is fully depreciated. That means depreciation should be 0. Here they gave 24. I mean, this is not depreciation as per tax. This is as per accounts. This is as per accounts. I don't need depreciation as per accounts. I need depreciation as per tax. Hence, what we will do is ignore this data. Ignore this data, because will we take this depreciation or the one we calculated? So leave that. From here, take your calculator. This is your income. From here, you reduce all this expense. What are you getting? From 8,10,000, reduce the circled numbers. You will get earnings before depreciation. Is my statement right? How much are you getting? 3,48,750. That is one approach. Or I'll tell you another shortcut. They've got profit before tax. They reduced the depreciation and got profit before tax. No. This depreciation we can consider or we need to ignore. But they've already reduced. So only add these two numbers. What are you getting? Same 3,48,750. Which is better? From here to here is better or these two is better? These two is better. So we will use this for example. Okay now. So what is earnings before depreciation every year? Simply take this number, add back depreciation. How much is it for the old asset? 3,48,750. Similarly, do the same thing for new machinery. These two data you add. 1 minute. I'll note that down. 4,28,750. Here it is 3,48,750. Correct, people? What is this? This is earnings after debris or before debris? We can't take this depreciation once again. Why? We can't take this. We can't take this depreciation. Why? Because this is depreciation as per accounts. How did we conclude? As per tax, old machinery is fully depreciated. I mean, this value should have been 0. So hence, this is not tax ka debris, it is accounts ka debris. Now you tell me, I need this value, or I need incremental earnings. How do I get incremental earnings? Old is giving 348, new is giving 428. So is NIV giving extra now? How much extra? 80,000. Check the solution. That's what I've done here. That is the next thing. What is the that's the next working note. Earnings before depreciation. Have I had 10 columns or only one column? Why? Because every year ka data changing or same? Same. Hence we have done common. First, profit, whatever they have given, I took, added back depreciation. That's so new old asset you only told 348, new it is 428. Comparing these two, how much is extra? 80,000. What is this, sir? Cash flow na? No. This is earnings before depreciation. So right now we have reached at one zone. What is that zone? Earnings before depreciation. Any problem? And now your format will come into picture. Fine. Don't start from sales now. We have to start from sales, or we have got earnings before depreciation. Earnings before depreciation. But the main culprit is depreciation same every year or changing every year? That means every year ka cash flow will be same or different. So we need to have one column or 10 columns. The main culprit again is this double fellow, depreciation, because changing every year. So next format check everybody. I did not have one column. I had how many column? 10 column. We will not start from sales. We already worked out. So far what did we got? Incremental earnings before depreciation. How much was that? Different every year or same every year? 80,000. Give the working note reference. Working note number 3 or something, this we got it. Done now. We want earnings before depreciation or we need cash flow? Cash flow. Now people tell me, how do you get cash flow? First you have to reduce all the expenses. Then get profit before tax. Then add back tax. Then 5 adjustments. Correct? Add back depreciation and OAS. That wala format. So first I will reduce depreciation. Depreciation or incremental depreciation? Incremental depreciation. You have to find or already found? Already found in the previous. So this is there, no? This depreciation each year you have to copy paste into the table. Same, whatever is there. One or two I will quickly show. 26,250, 24,281. 26,250, 24,281. The same value you have to copy. From earnings before depreciation, if you reduce depreciation, what are you going to get? Earnings before tax. Here it's earnings or everything on incremental basis. Every data here is on incremental basis. You can give the heading itself as incremental cash flow. That way you don't have to write incremental everywhere. It is understood that every data is on increment. So this is earnings before tax. From this, what are we going to do? Reduce tax. What are we going to get? Earnings after tax. These are simple numbers. No, it's okay, right? Simple calculations. And now 5 adjustment. Tell me people, what are those 5 adjustment? Add back depreciation. Whatever depreciation you reduced here, add it back here. And then OWAS. O for opportunity cost. Luckily not there. Even if it is there, it's a simple faltu adjustment. There are they aren't there. So opportunity, I have not written. If it is there, right. In your mind, you call out for yourself OWAS. But 0 components, no need to write in exam. Opportunity cost not there. Then W for working capital. We read the problem. Not there. Next. A for additional investment. We saw anywhere. We are buying a new asset in 4th year or additional working capital 5th year required. Blah blah. There or not there. Last. Salvage. Salvage value Allah. Incremental salvage value. Every number on a incremental basis. How do you get incremental salvage value? Old ka with new ka. Sir, they told in the problem, old asset if you continue to use for 10 more years, what will be the salvage value? 0. Old asset ka, if you continue. So here the decision is that only, no, to continue with old or go with new. If you continue to use the asset for 10 more years, its salvage value is 0. But if you buy a new asset, salvage value after 10 years will be 35. Old ka salvage value 0, new ka salvage value 35. So is new having an extra salvage value? How much? 35. That only becomes incremental salvage value. You will get it every year or once. Which year? 10th year. Outflow or inflow? Salvage value means the money you get when you sell the asset. So it's a inflow. Which year? 10th year. So 35,000 you have to put it only in the 10th year. Check. This is your 10th year. Salvage value 35,000. All other column 0. OWAS over. Subsidy not there. Short-term capital gain is there. I will discuss that a little later. Why am I not doing here short-term capital gain is because of this culprit. They told in the question, ignore capital gain tax. Ignore capital gain tax. First we will solve this question, then I will tell you this concept using this problem only. If this word was not there, how we would have solved also I will tell. But first let's finish off this question. And now people, once you do all this 4 adjustment, what are you going to get? Every year ka incremental cash inflows. every year ka incremental cash inflows. Okay, people? Any problem? Now, when they ask you to decide, always take the decision based on NPV. If they ask for a selection rule, which technique you will use? NPV always by default. If they need other techniques like profitability index, IRR, question will specify. If they say just decide the selection, always decide based on NPV. Now to calculate NPV, what is NPV ka formula? Present value of cash inflow minus present value of cash outflow. Now this inflow, like here, 63,875, we'll get it now or after first year? This 63,280, this 62, you'll get it now or at the end of third year? Means all these are what values? Future value. But we need present value. How do you get present value? Multiply discount factor. If you want, you can have one more table for NPV. Our question has already become lengthy, no? So anyway, we know this is a future cash flow. To get present value, we need to multiply discount factor. Multiply discount factor here only. You can save time. Otherwise, you have to take this data and prepare one more table for NPV. Faltu not required. Here only we will do it. Future cash flow and multiply by what? Discount factor. Discount factor they told in the question. How much? 10%. So multiply discount factor. What are you going to get? Present value of cash inflows. Adding all this, you'll get the total present value of cash inflow as 394,611. I'll give you a minute. Just observe. Ask me. Don't worry about this data. I will explain it to you later. Other than that, if you have any doubts or if you need some processing time, I will wait. This is something which you can acquire, or you can know all this only by solving up, people. There's some solving practice required for these questions. But yeah, we don't have that luxury of time now. But yeah, with the time available, I think this is the max we can do. Need a minute or okay now? Okay now, okay sir. Then this problem will get over. Another 5 minutes. Over. And now, what did we get? Present value of cash inflow. A wrong sentence. So, incremental present value of cash inflow. Don't forget that every number is on incremental. Now we need NPV or incremental NPV. Incremental. How do you get incremental NPV, people? Incremental present value of cash inflow minus incremental present value of cash outflow. Now, people, if you buy new asset, how much it will cost? 4,50,000. That is the value. Correct? But are we going to pay 4.5 lakh cash or 1 lakh will be adjusted for old asset? 1 lakh will be adjusted for old asset. So how much cash will go out? 3,50,000. Comfortable? That means how much? So salvage value of old asset 35,000 you should take, sir. This 35,000, first of all, you will get it not now, after 10 years. And this 30,000 we will never get, because this 30,000 we will get if you sell the old asset in the market. Are we selling the market or giving to vendor? And vendor is not giving 30, he is giving 1 lakh. So, and for new asset, how much it will cost? 4.5 lakh. So that means will we pay the vendor 4.5 lakh or 1 lakh adjusted for old asset? 1 lakh adjusted for old asset. So how much cash outflow will happen? 3,50,000. This is extra outflow. Yes, no? Only if you buy the new asset, extra outflow will happen to the extent of 3.5 lakh. Agreed, people? So incremental present value of cash outflow is 3.5 lakh. Inflow ka value is 394. Outflow ka incremental value is 350. If you net off these two, you will get NPV or incremental NPV. Incremental NPV. Decision rule is still the same. If incremental NPV is 0 or positive, accept. If it is negative, reject. This we got negative or positive. That means you will reject the new machinery or accept new machinery. As incremental NPV is positive. Incremental NPV means extra machinery. If you buy extra new machinery, it will give you an extra NPV. Since new machinery is giving extra NPV as positive number, new machinery ka proposal should be accepted. That's the drama. Clear? Pakka na? So format will work, right? But all this drama you need to do. By the way, people, if they ask straight line method, tell me, let's do a quick comparison. Working note number 1, I will do na or cut na. What was working note number 1? Depreciation base. Depreciation base and all is required for SLM method or not required? Not required. This so completely cut. you will do the normal calculation. What is that? What is depreciation as on the old asset? What is depreciation on the new asset? Straight line method, you already know the formula. Original cost minus salvage value divided by life. It's not actually original cost, it's carrying amount. Leave that. Okay, na sir? So old asset ka depre, you compare it with new asset ka depre. And that way, accordingly, you will get what? Incremental depre. And since it is straight line method, will depreciation change every year or same every year? That means this working not cut, this working not cut. Two-liner answer. If it is straight line. If it is WDV, all this will work. Same format will work. Done na people? And if it is WDV method, we know depreciation will change every year. That means cash inflow also will be same every year or change every year. So you can't have one column, you have to have how many columns? Full 10 columns. Done na? So those are the things. I'll take up one or two more questions. There we can discuss little more on that. Okay na people, everybody? And now one small concept is there. I'll explain of using this question only before we proceed further. Sir, in WDV method, tax works on what basis? Asset basis or block basis? In WDV method, we calculate depreciation rather on a block basis. Now, what if block comes to an end? What if block comes to an end? Sir, if you have at least one asset in the block, that means block is continuing. All assets, if you have sold off, means block will come to an end because there is no asset, right? For you to call it as block, there should be at least one asset, right? Now people, check same question. You had only, in fact, they told you this in the question. Check. What is that? Somewhere they mentioned. Consider that this is the only machinery is in the block of asset. That means in this block, how many assets are there? Only one. So currently we have an old asset. Now old asset we replaced with new. Old we replaced with new. Block will come to an end or new asset is there now? Since at least one asset is there, block comes to an end or block will continue? Got my answer? I'm talking about year 0. Year 0 mein what happened people? Old one you sold. New one you purchased. That means how many assets are there in the block now? How many assets are there in the block? Old one gone, new one came. So how many assets are there? One. Sir, if at least one asset is there in the block, means block has come to an end or block is continuing? Block is continuing. Done now. So at year 0 mein, has block come to an end or block is continuing? Block is continuing. There's no problem there. Correct? No, because old got substituted with new. Now imagine 10th year. 10th year, old one there. No, new one also you will sell at a salvage value of 35. Old already not there. I'm talking about 10th year. Which year? 10th year. Old one already sold at year 0 only. New one also sold at 10th year. That means any asset is there in the block or block has come to an end? Block has come to an end. Which year? 10th year. Correct? Pakka everybody? Now when block comes to an end, only when block comes to an end, we need to calculate something called short-term capital gain or short-term capital loss. I've showed the calculation for this problem, but in this problem, this value is not relevant. Why is it not relevant? Because in the problem, they specifically told to calculate capital gain tax or ignore. Hence, we don't have to calculate whatever I'm about to show you. If this line was not there, what you should do is what I'm about to show. Problem over, people. This is just for our knowledge sake. Sometimes they will say, ask us, they will not mention this word. That means you need to calculate short-term capital gain or short-term capital loss. How to calculate? Very simple. Here I've just checked. Now people, after 10th year, what is the book value of the asset? You already calculated here. Check your incremental depreciation working note. At the end of 10th year, what is the book value of the asset? 1,60,504. Correct? Yes, sir. So now check. WDV of the old or new plant and machinery. New plant and machinery. At the end of 10th year, how much is that? 160,504. Okay. Now this one is there or you're planning, you'll sell it in 10th year. You will sell it. But you will sell it for 160 or 35,000? 35,000. Happy face or sad face? Sir, value, book value as per tax is 160. Right. He did not like it only. He became very sad. But we sold it only for 35. Value is 160. Sold for 35. So we made profit or loss? 160 worth of asset to 35 people. How much loss? 125,504. Agreed? Pakka. Sir, whenever you make profit, our Nirmala Sitaraman ji will say, Tax kudra. Give me. Tax. Here it is profit case or loss case. On loss, you will pay tax or we will get tax benefit. You have studied tax and all, right? If because of loss, or in simple, if you have not studied also, no problem. In one liner, whenever you make profit, we will pay tax. But in the year of loss, this loss you can adjust it with the next income. So on loss, we always get some benefit. So hence, this is what, sir? Short-term capital gain or short-term capital loss? They will give you a rate of short-term capital gain. You don't have to remember tax ka rates. If they may, here let's assume short-term capital gain is at 30% only. So calculate 30% of 125,504. 37,651. This much tax you will pay or get the benefit. Sir, if you're paying the tax, it is a cash outflow. When you pay the tax, cash will go out. Here you're paying the tax or getting tax benefit. Getting the tax benefit. So that means this number, you will show it as an outflow or an inflow. You will show it as negative or positive number. Positive number. All the 10 years or 10th year. 10th year. Done now. So if at all that word was not there, which word was not there? Ignore capital gain tax was not there. I would have one more column in my cash flow working, which is what? 37,651. Which year? 10th year. That is what I've written and cut off. If you just check here, I've written 37,651 and cut off. Why? Because the question said ignore capital gain tax. Otherwise, this number would come here as a positive number. Pakka na ji? Suppose it is other way around, Andre. Meaning, let's look at this. Book value is same. 160 how much? 204. Suppose salvage value of the new asset is 2 lakh. Assume. Now sad phase, happy phase. Book value is 160. We are planning to sell this after 10 years for 2 lakh. I mean, this is a loss case or a gain case? Gain case. How much gain? Oh? These two come minus how much? 39,496. So on gain, will you get tax benefit or you have to pay tax? So what rate? 30%. So calculate gain is 39,496. That ka 30% you calculate. How much is it? 11,848. This is a benefit or tax to be paid? Tax to be paid. So it's an outflow. Every year or once? Which year? 10th year. So that means in this case, 11,848, you will show it as a negative number in your work. You will do all this only if the problem says what? To ignore capital gain tax or consider. Either they will say consider capital gain tax or they will not say anything. If they don't mention anything, then you'll have to do this. Only if they say ignore, then we'll have to ignore this working. Done na people? So one extra working should come in case capital gain tax gets attracted. That's all. That way, this is a good revision question. WDV method, everything kind of covered. I think we have 2 questions in ICA material on the same lines. If you want one more, you can review it once. In our question material, we have, I think, at least 3-4 on this. Straight line, WDV, everything we have covered. I think we have discussed. That should be okay. Okay now, people. And now, next one. Baglama.
Straight line method is given. Can we consider the number which is given in the question?
Yes. She's saying I'll consider the depreciation value given in the question. In that case, they will not get depre value. You'll have to calculate. But if they have given, you can consider. Perfect. Move forward, people. I'll take that as a yes. Okay. Now, after that wonderful problem, can we come for a simple question? Or 1 minute, hang on, no? Maybe. Okay. People, I have plans to do 3 questions more. 3 means 10:30, 2 means 10. No. You decide. Oh. No. Okay, na. Pakka na. 3 means 10:30, pakka it will take. Are you ready to sit? 5 minute break illappa. Break now, I can't, recording is going on. No, recorded should be like a labo. Yeah, it will be a problem for them. Exam day, they'll be watching macha. Now if I give break, they'll have to keep scrolling, which I don't want to give them that trouble. Same only. No concept. Just whatever concept we have learned, quickly we need to apply. That's all. Easy peasy only. Don't worry. For you, what is difficult, macha? That's chiller pillar. Okay, maybe since you said break, instead of break, we'll take a simple question. Okay, simple but a chintu, a good question. Okay, now check. Same study material question only. Navajivani Hospital is considering purchasing a machinery Some X-ray machinery they want to buy. How much value? 2 lakh. So this is inflow or outflow? Outflow. Founded, you're hunting for it, found already. Awesome. He's like, all the question number is there in my mind. Okay, projected life is how many years? 8 years. Salvage value expected is 18,000 at the end of 8th year. Okay. Annual operating cost is 20 to 500. The key word there is annual. Annual. That means every year cost is how much? 20 to 500. One happy face for me. Though the life is 8 years, I don't have to have 8 columns. I can have only 1 column. Because every year looks like the cost is same. Okay. Only thing I have to worry about is depreciation. I wish Jesus, Allah, Shiva, depreciation under straight line method. Not WDV. Okay. If it is WDV, we have to put up a working note and we have to have how many columns for cash flow? 8 columns. Let's see what here. It is expected to generate a revenue of 1,20,000 per year. Oh, this is also nice. Every year, same sales. Presently, hospital is outsourcing radiography to its neighbor. Currently, we don't have X-ray machinery. So, whenever a patient needs X-ray, we are referring to our neighboring diagnostic center. We are giving them business. Do you think we'll give them business at free of cost? No? There are so many diagnostic center. I can give it to so many. But I'm giving it to one specific diagnostic center means I'll take a cut. I'll take a commission. So check. We are outsourcing this to neighboring test center and we are earning a commission of 36,000 per annum. Net of tax. This is after tax. Currently we are getting this commission. Why? Because we don't have X-ray machinery. Hence we are outsourcing this work to test center. Now if we buy our own X-ray machinery, will we outsource the work or we will do it ourselves? We will do it ourselves. If you don't give this works to the test center, will he give this commission or commission lost? Commission lost. What is this? Opportunity cost. Inflow na outflow na. Inflow na out. Opportunity cost can be both plus or it could be minus. Plus minus. Minus. Why? Sir, one income we are losing. Till now, we used to get to this income. But the moment we buy this machinery, we will lose this income. One income, if you are losing, means income is reducing. Income is a benefit. One benefit, if it is reducing, means what is it? Outflow. That means you will put what sign? You will put it as a negative sign. Luckily, this income, you will lose it only 1 year or every year. I mean, this also opportunity cost also will come every year. For how many years? 8 years. That means looks like every data we have read is changing every year or same every year? Same every year. Awesome. Analyze whether it would be profitable to buy the asset based on NPV technique, profitability index technique. So, Depri, they have not told anything. In FMA, one convention. If Depri method not given means always SLM. Always what? SLM. You will do WDV only if the question mentions. Don't use your income tax rule. Income tax rule says every company should follow WDV method. Only power generating unit can go for SLM and all. No, here it is ulta. In FMA, for all our questions by default, we will take what? SLM. We will take WDV method only if the question mentions. Any mention or no mention. That means J. SLM. SLM means every year ka Depri also same. So 8 columns for 8 years or 1 column enough. 1 column enough because every year ka cash inflow is going to be same. Even if you put 8 columns wrong, no, but you will get the same data every year. Waste of time. That's all. Okay, Naji. So this is one. Before you proceed the question, ask this question. Should I have many columns or 1 column? When you will have many columns, when cash inflow is changing every year. Okay. But if every year ka cash inflow is same means you can have only 1 column. And so I'll solve this under 1 column approach. Pakka na. Now people, to calculate NPV, we need cash inflow. Have they given cash inflow or have they given sales? So tell me the order now. From first, what do you do? From sales, you will reduce operating cost. 2 expenses you will reduce. One is operating cost. Another one is depreciation as per SLM. Then you will get, or maybe we'll do it here only. Check. What is the sales, people? Quickly confirm. Sales is 120. Operating cost is 22. 500. Calculate depreciation also for me straight away. 1. Incremental approach or normal problem? Sir, incremental will come only when you are replacing existing asset with new asset. They will give you existing asset data, new asset data. Only then incremental. Here 2 data available or only 1? Normal problem. Calculate depreciation. You bought the asset for 2 lakh. Salvage value is 18,000. So 2 lakh minus 18,000. Original cost minus salvage value divided by life. How much, people? Huh? 750. This is the depreciation every year. Okay. Now that means 3 data. Sales how much? 120. Cost, operating cost 22,500. Check. Take a now. Sales 120, operating cost 22,500, depreciation 22,750. That's all. From income, if you reduce all expense, you'll get profit before tax. Reduce tax, you'll get profit after tax. Now, 1 minute, everyone check the screen. From PAT, there are 5 adjustments. What are those? Add back depreciation, add back OAS. Be little careful over here. Are we having 10 columns or 1 column? Why? Because every data comes every year. Different value, same value. One by one, we will see adjustment. First, you add back depreciation. Depreciation will come once or every year? Every year. So, that means, can I add bindas? Yeah, add back depreciation bindas. Because it is coming every year, same value. And then over opportunity cost. There are, yes. Now, people, this number is on a before tax basis or after tax? So, opportunity cost also should be on after tax. Here, have they given opportunity cost on after tax? Good. They only given net of tax. Net of tax in the after tax. How much is that? 36,000. Sir, suppose if this was before tax, we have to do something on after tax. How do you get in FM after tax basis? Take the number and multiply 1 minus tax rate. You will get after tax. But here we have to do this or already on after tax basis. So that means take the number as it is. Yes, sir. Now, everybody got it? No. Both adjustments are tested in the problem. Okay. Now, 36,000. We have to take it as positive number or negative number? Negative. Why? One income we are losing. One benefit we are losing. So, 36,000 will be negative. Considered. Yes, negative. O over W. W for working capital. There or not there? Not there. If it is there, will you bring it in this table or you cannot? In this approach, can you bring this? No. If you write, suppose working capital was 1 lakh. If you bring it in here, what does it mean? Sir, this is annual cash inflow, meaning data repeats every year. Additional working capital and all will come every year or only at year 0 and year 0 may outflow, end of the project inflow. That means OAS works, but here you can't put in, you'll have to put in the NPV table. Okay, now I'll show you once again if you want. Anyway, not there. A for additional investment, there or not there? Not there. If it was there, would you have put it in this table? No. Why? Because it's not repeating every year. It comes only once. If it comes only once, put it in the next table. How I'll show you for salvage value. Last is S. S for salvage value. It could be subsidy. It could be short-term capital gain or short-term capital loss. Here anyway, they've not told anything about block. Moreover, we are not doing block method. We are following SLM method. So SLM method, irrelevant. Leave that. Subsidy, not there. Salvage value, irka. How much? 18,000. Salvage value outflow or inflow? Inflow. Can I say plus 18,000 here? Sir, if I write plus 18,000 here, it means this 18,000 we will get every year. Salvage value you will get every year. No, you will get only once. We have to consider salvage value, but we can't consider it here. I'll consider it in the next table. Why? Because it doesn't come every year. Okay now people. So how much is your net annual cash inflow we have got? 39,075. Now calculate the NPV. NPV ka normal table. Year cash flow discount factor, present value. Year 0, how much did you invest to buy the asset? 2 lakh. Now this 39,075 is changing every year or same every year? For how many years? 8 years. So that means should we have PVIF or PVAF? If every year if you're getting same cash flow, we can take PVAF. Year column what I'll write? 1 to 8. How much cash inflow? 39,075. So at 10%, give me PVAF for 8 years. 1 divided by 1.1, press equals to button 8 times and then GT button. 334. Multiply and you will get the present value. Done now. Now few things we ignored. What are those? OAS. OAS mein opportunity cost will be considered. Yes. What about W? It was not. It was not there. Suppose it was there. Working capital anyway we'll consider it year 0, and also you will have one more year column 8 and bring it in this table. Got it? And which one else we ignored? Salvage value. We did not consider salvage value in this table. Why? because it does not come every year. Which year salvage value comes? Year 8. So hence the year column have 8, and what is this? 18,000 salvage value. If you can't consider in this table, put it in this table. Done now. Whichever data repeats every year, put it in here. Whichever is not repeating, put it in here and finish it off. Okay, na sir? The salvage value outflow or inflow? Inflow. Every year or once? Once. That to which year? End of the project, which is 8th year. So we will take PVAF or PVIF. 1 divided by 1.1, press equals to button 8 times. You will get it. And it's your cash flow. And NPV is positive. So reject or accept. Decision is accepted. Then they ask profitability index also. That is very simple. Now these two are inflows. This is outflow. How do you get profitability index? Present value of cash inflow, which is this, divided by present value of cash outflow. That's what I've done here. Okay, sir. Simple problem, but good problem still because of the opportunity cost. One subtle adjustment for opportunity cost is also, don't forget, opportunity cost also should be on a net of tax basis or after tax basis. If they don't mention, or if they say if it is before tax, then you have to take the number and multiply 1 minus tax rate and then only take it. That's a hidden adjustment. Some questions may it is tested. Now this question over. Need 1 or 2 minutes to review or sorted? Or take away, or tell me this takeaway of this particular question. One, WDV method not there. It is SLM. It means every data is same every year. 8 columns or 1 column is enough. 1 amount column is enough because every data any which way is same. From sales, first you get PAT by deducting all the expenses. After PAT, 5 adjustments. Add back depreciation. Depreciation will come every year, so you can aram se bring it into this table. Oh, opportunity cost also will come every year. You can put it. Working capital, additional investment, salvage value. In this approach, can we capture here or next table? Next table. Because they don't come every year. They come only in a specific year. Hence, you'll have to bring it to the next table. Still, the checkpoint is still OAS only. Here, you can't come in. It has to come in here. That's it. Next question, Asarji. Next question, Asarji. Yo, Papa. Okay, how many more I told you? 1, 2, or 2 more. That's all. Okay, we'll see. We'll see. Maybe 10, 15 we will try. We will try. If you're hungry, you can eat in the class. I have absolutely no issues. Feel free. I will not put kannu. I can't say the same thing about your neighbor. Share and eat. Better. Not with me. I'm fine. Yeah. Okay. Yes. 31. Again, I think this also is a study material question only, or maybe some RTP question. I think mostly study material. Okay. Question number 31. I'm taking those questions where I can cover the concepts. Okay. And also, more or less all the concepts I want to cover. That's the intention. Now people, check this question. 31 no. 31 no. Carefully read the data. XYZ is planning. Simple question only this is, but good number of adjustments are there. XYZ is planning to introduce new product with a life how many years? 8 years. Initial equipment cost is 3.5 crores. So that they said initial equipment cost. So investment will happen at year 0. Inflow na outflow na. This is year 0 ka outflow. 3.5 crore. Not only that, we also need additional equipment costing 25 lakh. When? To be purchased at the end of 3rd year. You remember OVAS? OVAS mein there was A. What was A? Additional investment or additional capital. Here you have to buy one more asset by paying how much? 25 lakh. When? Now a 3rd year. This is your additional investment we are talking about. Clear? That means you need to be little careful. We have 1 asset or 2 asset? 2 asset. Original asset, additional asset. Original asset ka depreciation starts from 1st year only. But additional asset you purchased only at the end of 3rd year. That means additional asset ka depreciation only will come from year 4 to year 8. That means we need to have a depreciation working note here. I think it's a straight line method only, but still we need to have a working note for that. At the end of 3rd year, original equipment, no salvage value, no resale value. Additional equipment can be sold for 250. So what is this? Salvage value. When you will get? Now or 8th year? 8th year. Every year or once? Once. That too in 8th year. A working capital of 40 lakh is there. You already know the concept. For working capital, what you will do? At year 0, it will be an outflow. End of the project, which is year 8, it will be an inflow. Same number. Clear? And that means at year 0, there is one outflow or multiple? What I would suggest is at year 0, if you have multiple outflows, have a separate working note. Otherwise, not required. Here at year 0, you're buying an old asset or an asset for how much value? 3.5 crore or 350 lakh. And working capital, how much you are investing initially? 40 lakh. So total will be 3 crore 90 lakh or 390 lakh. If there are multiple adjustments, better to have a working note in my view. Okay. Now it will be released by the end of 8th year. Should they have to tell this? We already know working capital, we any which way, we assume that at the end of the project, we will recover or release, one and the same. 8th year, they're saying it is an inflow. They don't have to say any which way, we will do the same assumption. Project will be financed by sufficient equity capital. Their headache. Sales volume, sales volume over 8 years. I don't like this. They gave number of units sold, same every year or different every year. Asho karma khanda. So what now? 1 column, 8 columns. 8. Ayyalada. Year 1, 2, 3. 4th year, 5th year, every year 2,70,000 units. This is 6th year, 7th year, 8th year, every year 1,80,000. Life is how many years? 8 years. 8 columns. You can have 4 to 5 as 1, 6 to 8 as 1 if you are comfortable. But I prefer to have it separately because some students may get confused with that. So I have done 8 columns. The culprit here is what? Sales. Okay. This is what sales are or number of units sold are. What is selling price per unit? 240. So by now we got to know that we have to have 8 columns. So I think so far I figured out 3 working notes. Can you tell me what are those? Working note number 1 for outflow, because there is working capital also, addition thing also. So I'll make 1 working note for year 0 outflow. Next, 1 working note for depreciation, because we don't have 1 asset, we have 2 assets. 3rd year for annual cash inflow. 1 column approach or 8 column approach? 8 column approach. Yes, Ajay. Can we, fadafat, so far whatever we added, can we finish it off? Year 0 outflow, tell me people, how much? 350 lakhs plus 40 lakhs. Check. 390 lakhs, working note number 1 over. Outflow means showing it as negative number. Then depreciation. Calculate depreciation. Original asset you bought for 350 lakhs. Salvage value 0. Life is 8 years. What is depreciation every year? By default, I told no, if they don't mention the method, it is always straight line. Calculate. 43.75. This is on what asset? Original asset number 1. Asset number 2, when did you buy? Asset number 2, you bought it for 25 lakh when? 3rd year ending. So depreciation on asset 2 will start from 4th year beginning. 3 years at the end of 3rd year you purchase. So depre will start from 4th year and project will end at 8th year. So for first 3 years was new asset 2 there or not there? So asset 2 was there in the project only for 5 years. So take original cost 25 lakh, salvage value they have given how much power? 2,50,000 here. You bought it for 25 lakh, salvage value 2,50,000, life 5 years. How much? 4,50,000. Okay, people. Now check how I presented. For year 1, year 2, year 3, we only have original asset. That means every year depre will be 43.75. But from year 4 onwards, original asset ka depre will be 43.75. Asset number 2 ka depre will get added 4.5. So from year 4 onwards, depreciation will become 48.25. It will change or 48.25 from now onwards same. That's a presentation. Done now. Can we move on to the next? Next is your cash inflow. 1 column approach or 8 column? 8 columns. They have given number of units sold. People, here be careful. Here they have written 4 to 5, right? 4th year, 5th year put together it is not 270. 4th year also 270. 5th year also 270. Here also same thing. 6th year 180. 7th year also 180. 8th year also 1,80,000. So this is the number of units. How do you get sale value? Number of units multiplied by the selling price. When the numbers are big, try to present in lakhs, hundreds or crores. I think here I present it in lakhs. So 72,000 will become 0.2 lakhs. 0.2 lakhs into 240 you do. 1 or 2 years you do. 0.72 into 240. How much are you getting, pa? 172.8. 1 or 2 I'll quickly show. Next year you calculate 1.08 in lakhs. 1.08 into 240. 259.2. So on and so forth you do it. This is your sales. Next, what have they given? Variable cost is 60% of sales. This is easy, no? Sales ka 60% if you calculate, you will get the variable expense given. Just sales ka this number ka 60% you'll have to do. Manageable. Next, what expense given? Where is it, pa? Where? Huh. The people, they did not say fixed cost. They said fixed cash operating cost. Fixed, the keyword there is cash. Fixed cash operating cost means depreciation included or excluded here. Depreciation is a non-cash expenditure, and here they told fixed cash operating cost is 36 lakhs. So depre here included or excluded? Excluded. Excluding depreciation, your fixed cost every year is 36 lakh. So bring in that 36 lakh. Now depre we already know. For first 3 years, what was depre? 43.75. From year 4 onwards, what is the depre? 48.25. Copied that. Done now. Over. No other expense. I don't think so we have any more expense. Easy. Tax rate how much? 30%. Discount factor how much they're saying? After tax cost of capital is nothing but discount factor, which is 12%. At 12%, good thing they only given PVIF. Okay, sir. One more sentence is there. I'll talk about that in a bit. This one I'll tell you. But everything is okay, no? From sales, if you reduce all the expense, you'll get profit before tax. Easy. Now everyone just check the screen for a minute. When you did sales minus all the expense, concentrate on the first year. You got profit or you got loss? How much? 10.63. Easy. Correct? All the other years are profit. Profit means you have to pay tax. No problem there. But loss we got. We just now studied short-term capital loss and gain. On the profit, you will pay tax. On the loss, you will get tax benefit. But 1 minute. So ideally, what you should do? Tell me, according to you. Okay, or maybe first I'll tell you this. Check for 4th year. How much is profit for 4th year? 174.95. What is the tax rate? 30%. So how much tax? Calculate 174.95 into 30%. 52.485. This tax we will receive as a company, we will receive or pay. So inflow or outflow. So this is negative. Correct? Huh? On the same way, here it's a loss. Here it's a loss. Ideally, your mind or heart to kidney is saying what? On loss, we get tax benefit. Benefit means negative or positive. How you will calculate? 10.63 ka 30%. 10.63 ka 30%. How much is that? 3.18. This should be negative or positive number? Positive number. Yes, sir. That's what your suggestion is. Correct only. But one sentence they've used in the problem. First read that. Loss of any year will be set off from profit of the subsequent years. Any year if you get a loss, no, you can adjust it. Income Tax Act allows you to carry 7 years or 8 years. 8 years. Okay, leave. But here we'll go in FMA, we will follow question ka guideline. Never question the question. Go with the flow. Loss of any year will be set off from profit of how many years? 2 years. So question is saying any year loss if you get, you can carry this loss forward and adjust with the next 2 years ka profit. When they say this, right, when they use this sentence, the year you get a loss, that year you make the tax to be 0. Now, this loss you can carry it and adjust for how many years? 2 years. Next year, no people, you will not pay tax on 23.93. Whatever loss you made, first you will adjust. From 23.93, adjust the loss of 10.63. 23.93 minus 10.63. Okay, I'll only do. No need to do. 23.93 minus 10.63 you do. You'll get some profit. On that you calculate 30% tax. Got it, huh? This is your carry forward option. Done, everybody. So you will do this when the question mentions the carry forward point. If the question does not mention anything about carry forward point, year of loss only you take the tax benefit. You said no 3.18 something, no? That you write it in the first year. 2 approaches. Both, did you get it? What does that summarize that for me? If they don't say anything about carry forward, then whichever year you get a loss, you take the tax benefit. You write tax as a negative number or positive number. How? Take this number and multiply 30%, you will get 3.18 something, no? Add that. Which year? That respective year. But if the question says carry forward the loss for 4 years, 5 years, then in the year you made a loss, make the tax as 0. and adjust this tax loss with the future year profit and accordingly calculate tax. Everybody go down. This is a new adjustment. That's what I've written in the chart. I'll quickly show you. Or maybe last page I will show it to you once again. Now we have covered all the last page ka adjustment through problems. Now afterwards, any drama or no drama? Loss got adjusted in first year only. No? Or rather, first year ka loss got adjusted in second year. So from year 3 onwards, same drama. So you got profit after tax. From profit after tax, 5 adjustments. What are those? Add back depreciation. Whatever you have deducted here, add back. Then O was. O for opportunity cost, not there. W for working capital is there. How much working capital? 40 lakh. You already considered as year 0 outflow. Now, inflow. End of the project inflow. Here, project is ending at year 8. Year 8 mein 40 as an inflow. Yes, sir. And then A for additional investment. There. You bought a new asset. When? Third year ending. How much? 25 lakhs. Third year ending, you bought a new asset by investing 25 lakhs. Coming in or going out? Outflow. So negative. Yes, na Ji. Last S for salvage value. Eureka. Yeah. New asset has a salvage value of 2.5 lakh. Old asset, no. Additional asset, 2.5 lakh. Any subsidy Eureka? Ledo. Short term capital gain concept, not there. So 2.5 lakh salvage value for asset number 2. Which year? 8th year. Outflow or inflow? Inflow. By doing this, you will get annual cash inflow. But all these are present value or future value. Multiply discount factor and you will get accordingly present value of cash inflow. Total them up and you will get total present value of cash inflow. This is your present value of cash inflow. This is your present value of cash outflow. This is your present value of cash outflow. When you net off, you will get NPV. And NPV is positive. So reject or accept. Just the format. It will take time to solve this. Conceptually not difficult. If you are able to, even on the examination day, you should revise this only. What adjustment will go where? That's all you need to revise. Don't waste your time calculating each component. That anyway, your mind will do that on the last day. Now focus more towards where, what numbers. That's it pretty much. Okay, now see only this much. Chiller. Correct? No. Last question for the day. Chudama. 1 minute. First. Raja, Kanna, ikkada chudupa. Carry forward loss. 2 things we learnt. What is that? When question mentions loss can be carry forward. In the year of loss, you will make taxes 0 and adjust this in the future year. If the question is silent, if they don't mention anything, what you will do? In the year of loss only, you will take the tax benefit, meaning you will make the tax as a positive number. That's what I've written here. Makes sense, huh? Short-term capital gain loss, we have already explained through the problem. I'll not go through this again. This is your depreciation base. Tell. First of all, this is only applicable for WDV method. And I'm asking you under incremental approach. Step number 1. Calculate depreciation base of the old asset. Calculate depreciation base of the new asset. How do you get this? Take old asset ka book value. Add purchase cost of the new asset minus salvage value. By comparing these two, you will get incremental depreciation base. On this incremental base, calculate depreciation, which you will get incremental depreciation. That's all I've written. Last, don't forget OS, which we're never forgetting. Okay. One more is there. This is not subsidy rather. Subsidy from government is there. One point is there over here. It was tested in a couple of questions. No time for questions. So I will quickly tell you what you should do in that question. Only this was an extra adjustment. First of all, subsidy means we are paying the government or receiving from government. Receiving from government. There are 2 ways through which subsidy question can be asked. One, they will say, company has purchased an asset. Company has purchased an asset. Because of that, government gave subsidy. Tell me back once again, what is that? Company purchased a particular fixed asset, machinery, whatever. Because of that, government gave a subsidy. That is one approach. Now you tell me, or maybe I'll give you some numbers. Let's say people, pink, no purple, okay, no pink. Now I don't mind using pink. All right. Let's say people, we purchased the asset for 10 lakh. We purchased the asset for 10 lakh. Government gave a subsidy of 1 lakh. Government gave a subsidy of 1 lakh. How much did we buy the asset for? 10 lakh. How much we got the subsidy? 1 lakh. Now touch your heart and tell, is the cost of the asset really 10 lakh? 10 lakshana. Why? On one hand, you are paying 10. On other hand, you are receiving 1. That means the cost of the asset is really 9. Correct, Aji? So this is your cost of the asset for what purpose? Depreciation. Now you will not calculate depreciation on 10 lakh, you will calculate it on 9. When subsidy is related to asset. When subsidy is related to asset, first reduce the subsidy and then only you calculate depreciation. Goinda, got it? Everybody. He's looking at the door only. When will I go and have sapad da? He's literally sitting this only. Right door, nera. We'll go much. 5 minutes, that maybe 15 minutes, much. Like sir. Too much blood you are putting today. Okay, no problem. You can revisit. Again, we'll upload this particular video on YouTube as well. As a marathon, we will upload it in about 2-3 days. They have to collate and upload. They may take another 3-4 days time. It'll be there. So if you want, you can watch it again later on. Okay, no, macha. Now he's saying I'll walk out of the door only. Now, what is this concept? If subsidy is related to the asset, though you purchase the asset for 1 lakh, whatever subsidy you have received, first reduce and then calculate depreciation. If it is related to the asset, they will tell the problem. Another way they will say, since the company is operating in a special economic zone, government is giving a subsidy of 5 crore. Now you tell me, is this subsidy related to a specific asset or a business? Because we are doing a business in special economic zone or SEZ, we got a subsidy. Is this related to any asset or not? Now you will reduce the subsidy for depreciation calculation or don't reduce. That's also good. Rest everything same. If it is related to asset, reduce subsidy and then calculate depre. If it is not related to asset, do not reduce the subsidy for depreciation purpose. Done, Sarji? That's all. It's a concept. Now, last question. If you want to do it, we'll do it. Otherwise, this question we have anyway done it in our regular class. But there's an RTP question also. Many long years back it came. RTP May 2019. No? I think in 2025 RTP also they repeated the same question. We have done the same question. We have done it in our class. It was question number 39 in our class notes. Okay. If we want, we will do. Where we will watch the recording. We will. Tatastu sapad. Do means 20 minutes. Okay. Now you were saying something, ma.
Should also consider again in the
Sir, she's saying subsidy again you will consider in OAS. Yes, ma. Absolutely, yes. That's the reason. Last S is for 3 things. Don't forget. In OAS, last S is for 3 things. Salvage value, subsidy, STCL or STCG. So that's made it as common. Yes, it will come. That's a valid question. Now, 39th. Yeah. Okay, yeah. Don't worry, by 2:30 I think we should be done today. Not much. This was the biggest topic. Next 2 are pretty chiller pillar. So I want to do the biggest one first. Where our energy is full, no. After this, so we'll be like that wala feeling. So I don't want to take up this topic at that point of time. So fine. BT Pathology Lab is using an X-ray machinery which has reached the end of. People here, we don't have to solve all the question over here. One adjustment, or rather I would say 2 adjustment is good over here. It's definitely a lengthy question, but only 2 are different, or you could say, yeah, little thing you need to pay attention. Rest all, everything is just format will automatically take care. Pay careful attention to while reading. Now one lab, they are using X-ray machinery, but that X-ray machinery is almost reached the end of life. Following new X-ray machine from 2 different brands with same features are available. Now we want to replace. The moment they say replacement, our mind should run towards incremental. But if you just check, have they given existing machinery ka data? They have only given new ka data. So can we do incremental or not possible? Not possible. For us to do incremental, we need old asset ka data, new asset ka data. Compare and then only we will get incremental. Here old one not given. So this is not incremental approach, it is normal problem. Everybody has come to first that understanding. Now option, we have one asset or two assets to buy. Either we can buy brand XYZ ka new asset or brand ABC ka. If you buy XYZ, how much it will cost? 6 lakh. Life is 15. And this is the benefit alag prabhu hai. This is maintenance cost. This is also cost too. This cost you will incur at year 0. This cost you will incur every year. From year 1 to 5, every year how much cost? 20,000. 6 to 10 every year, 28,000. 11 to 15 every year, 39,000. Depre rate 4%. If they don't give depreciation method, we always SLM. If you go and buy a new asset from ABC brand, it will cost 4.5, but life is only 10. Stop there only. Life same unequal. Unequal life means first thing is that should always come. So there's a normal problem clubbed with EAC. EAC will always come when the life is different. So we can't just calculate NPV and leave it at that. We have to calculate EAC and do it and then give the suggestion. Now 10 years, first 5 years 31, next 5 years 53, depre 6%. Two options. They didn't leave it at that. Check. I'll come to this in a bit. Check. Alternatively andre one more option. The machinery of brand ABC can also be taken on rent and returned back to the owner with the following condition. So how many options? 3. Either you can purchase XYZ, purchase ABC or take ABC on rent. So 3 options you need to solve and suggest which one to go for. Okay na sir? Now if you're going for rent option, careful. Annual rent shall be paid not at the end of the each year, at the beginning of each year. So first rent you will pay at the end of first year or year 1 beginning only? Year 1 beginning andre year 0. Careful. How much? 1 lakh 2. Annual rent for the subsequent 4 years will be 1 lakh 4. But mind you, every rent is not at the end. It is at the beginning. Okay na? So that means first rent you will pay at year 0. Then at year 1. Then at year 2. Then at year 3. And year 4 like this. Okay. Then for the next final 5 years rent is 109. That is a breakup they have given. 10 rents, when you will pay, how much you will pay, they have given. Every year same. Rent agreement can be terminated by BT Labs by making a 1 lakh payment as penalty. By chance if you cancel the lease, you have to take the lease for how many years? 10 years. By chance if you cancel, you have to pay how much penalty? 1 lakh. But this penalty will reduce by 10,000 each year for the period of rental agreement. If you take the asset on rent for 1 year, how much minimum period you should take for? 10 years. After 1 year if you cancel, after 1 year you need to, if you cancel, you don't have to pay 1 lakh penalty. Each year you use the asset, penalty will keep reducing by 10,000. So that means after 1 year if you cancel, then you'll have to pay how much penalty? 90. After 2 years if you pay cancel means 10,000 minus 10,000 which is 80. Like this. Next May they will say some year we will cancel penalty. Matlab you will cancel lease. Maybe that's why they have given this adjustment. We will see. You are required to advise X-ray machinery. Say the period is 20 years. Keeping the period as 20 years. Faltu. Any which way I don't need this. Because I am anyway working out this problem on EAC. Because these two periods are same or different? Different. Now here they can say 20 years or they can say 200 years. To hell with them. I'll just do EAC. Life is different. So absolutely EAC. Pakka na. Second option we will say different. Cost of capital. Discount factor how much pa? 12%. Can we do it? If you read the question, this is cost too. This is also cost. Where is benefit? Not given. So EAC from benefit angle or EAC from cost angle? Cost angle. But there is one benefit. That's all. Rest all benefit not given. Okay now people. So that means sir, looks like in this problem, cost is more, cost only is more, no benefit they have not given. That means still EAC only. So we'll have to work it out accordingly. If you want, you can change the signs here because all these are on cost. No. If you want in this problem, you can, or maybe I'll come to that. Hang on. Maybe this alone I will read. This is one highlight of the question. This and EAC. Rest everything is faltu. Just lengthy ashte. So observe everybody this. Residual value of both the machinery shall be dropped by 1/3 of the purchase price in the first year. Take your calculator. First for XYZ, what is the purchase cost of the asset? 6 lakh. How much it should be dropped? They are saying 1/3 of the purchase price. Purchase price is 6 lakh. 6 lakh ka 1/3 is how much? 2 lakh. Which year? First year. When they use this sentence, what they mean is depreciation for first year is 6 lakh ka purchase price ka 1/3. That's what they are trying to say over here. Residual value dropping is nothing but your depreciation. What is depre for first year, people? 6 lakh ka 1/3. How much is that? 2 lakh. From then onwards, what is the depreciation? 4%. What is the total life of this asset? 15 years. First year ka depre we have already got. Then how many more years we need to find? 3 Allah, 14 years. 14 years, yes. What is the value? How do you calculate? 6 lakh ka 14% into 14%. How much is that? Calculate. 3,36,000 you're getting. Didn't understand? Once again, what is first year ka depre? Everyone understood that? 2 lakh. That part is clear, everybody? From year 2 onwards, the depreciation rate indirectly they're telling is 4%. 4% on what? Same purchase price. How much is that? 6 lakh. If you do 6 lakh of 4%, you will get depreciation for 1 year. We need it for 1 year of remaining 14 years. So what is the depreciation for remaining 14 years? I'm asking. 6 lakh ka 4% into 14 years. Clear? How much is that? 3,36,000. Done na, Sirji? Everybody good? Pakka na? Now, everyone check. First year ka, take your calculator. First year depreciation how much? 2 lakh. Balance 14 years, how much depre? 3,36,000. So, how much is the total depre you have charged? 5,36,000. In 6 lakh mein se 5,36,000 you have depreciated. How much you did not depreciate? That only is salvage value. Because what is straight line method ka formula? Original cost minus salvage value. That means will salvage value get depreciated? No. From original cost, you remove salvage value and the balance will get depreciated over life. Correct? No. In this problem, salvage value was not given. That is the crux of this question. Yes, sir, people. That means another way. What is that now? To get salvage value, what is another way? From the original cost, reduce the total depreciation. Automatically, you will get what? Salvage value. Clear? Pakka na? Pakka. If you have understood, for ABC brand, for the next asset ka, you will calculate salvage value. Can you calculate? I'll read the data for you. One minute, careful. What is cost of XYZ? 4,50,000. Same thing. They said residual value of both the machinery shall be dropped by 1/3. Which year? First year. Thereafterwards, it shall be depreciated at the rate above. Thereafter means from year 2 onwards. Question is saying. So now first you tell me, what is depreciation of ABC for first year? How did you calculate? Cost, purchase price ka 1/3. 4,50,000 ka 1/3. How much is that? 1.5 lakh. Pakka. Thereafterwards, you will calculate depreciation for 14 years or 9 years. This asset ka life is only 10 years. 1 year, first year depre you already got. Remaining is how many years? 9 years. How will you calculate? 4,50,000 ka 6% into 9 years. 1 lakh? No, here I'm getting 243. 243, correct? No. This is your total depreciation. From original cost, if you reduce total depreciation, what are you going to get? Salvage value. Understood? The whole crux of this problem, one main crux of this, EAC any which way we know, the main crux of this problem was only salvage value. I've just written it here. If you have any doubt, ask, or if you're comfortable with the number, I'll move forward to the next. Pakka ji, whether understood or not, go you tell it. Easy only, no? Manageable, right? Here, residual value getting dropped, if they say mean, that is nothing but your depreciation for that particular year. Which year it got dropped? First year. So, first year ka depreciation is that. That's what the question means by this. Okay, this is sorted. Now, normal problem. This is also cost. All these are also cost. Only one benefit is there, which is what? Salvage. Sir, you can solve under normal approach. But under normal approach, outflow cost we show it as negative, benefit we show it as positive. But here if you just check, no, they have given lot of data in cost and only one benefit is there. Hence what ICA has done is cost data they presented in positive, salvage value they have been presented in negative. Because it's easy to work with positive number than with the negative numbers. So that's, if you want, you can stick to the normal one. All the cost you can show in negative, salvage value you can show in positive. So your final number will be negative and EAC also will be in negative. Decision making, you need to be careful. With the decision, no, when two negative numbers are there, when you ask to compare, some students will be like, easy to compare with the positive number. Hence, I would suggest for exam, when they give you all cost data, when they give you a lot of cost data and very less inflow data, make the cost as positive. Benefit, you make it as negative. Easy for decision making. Comfortable? So that is what they have done here. Check. Everything they have only given. We just need to solve. Here, let's review this question. First, let's do it for machinery. Machinery, what is that, pa? XYZ. Let's get the basic data right. For XYZ, where it went? For machinery XYZ, what is year 0 outflow? 6 lakh. You're buying it initially, no? So year 0 outflow is 6 lakh. Have they taken a? Yeah, year 0 outflow 6 lakh. And here all the cost in positive number, salvage value in negative. We already got salvage value. What for XYZ? What is the salvage value we got? 64. They have taken that. I'll come to that. Here they have taken 64 and they have taken it as negative. Salvage value you will get now or end of the year. What is the life of this asset? 15 years. So 15th year you will get salvage value 64. Okay now people. Now what about year 1 to year 5? Benefit or cost? Cost. So we are showing negative or positive here? Positive. Since is the cost different every year or same every year? So you want to do it 15 years separate column. Problem will become lengthy. We'll use PVIF or PVAF. So in the year column we'll write 1 to 5 and take how much? 20,000. Take na. What is the discount factor? 12%. Tell me people, for 5 years, what is the discount factor at 12%? 1 divided by 1.12, press equals to button 5 times and GT button 3.605. This is your future cash flow, multiply and you'll get the present value. All that is common. One more hidden adjustment over here. It's not hidden. We have done 2 questions in regular class on this. But anyway, just check here. Year 6 to year 10, how much maintenance cost? 28,000. Different or same every year? 6 to 10, 28,000. So 6 to 10, how much? 28,000. Now how to find PVAF for this? If they ask for 1 to 10 years, very easy. We'll press equals to button 10 times and then GT button, done. But here we are finding from 1 to 10 or 6 to 10. 6 to 10. 2 approaches are there. Both I will tell you. I feel one can be done directly in calculator. One way you can do is first to do it from year 1 to year 10. First to do PVAF from what? Year 1 to year 10. Okay, maybe tell offer. At 12%, tell me PVAF for 10 years from year 1 to year 10. 1 divided by 1.12, press equals to button 10 times. And then GT button. How much? 5.650. Okay, we need it from 1 to 10 or 6 to 10. That means year 1 to year 5 ka PVA. We need or we don't need? We don't need. That we have already computed here only. 3.605. 3.605. That is included here now. We need that or we don't want? We don't want. So eliminate that. That way you will get year 6 to 10 ka PVAF. How much is it? 2.045. That's the number. This is one approach. Little lengthy. Can I just show you how to get this directly in calculator without doing all this plus minus drama? Everyone okay? Alright. Take your calculator. Sir, for this method to work, your M plus button should be there in your calculator. If it is not there, so throw your calculator and get a new one. Or maybe do this approach. Okay, Naji. This approach will only work when you have M plus button. First to memory you clear. You must have pressed a lot of things. MRC button 8-10 times. Taka you press. Clear memory. Memory cleared. From here a calculator. Here also sir. Pakka calculator will remember. This one gone. And now people, how to do it in calculator? Simple. We want it from which year to which year? Year 6 to year 10. At 12%. No? 1 divided by 1.12 you do. Press equals to button 5 times first. Only 5 because we need it from 6th year, right? First press equals to button 5 times. Where it went? I have to press MRC. Okay. 1 divided by 1.12. 1, 2, 3, 4, 5. My calculator is showing 0.5674. We are also there on the same line. 5 years over. Then we need it from 6 to 10. Again, 1 minute. Do what I'm only saying. Press equals to button. Immediately M plus button. equals to button immediately m plus from 6th time onwards. Okay. Now again equals to button m plus button 7th time. Again equals to button m plus button 8th time. Again equals to button m plus button 9th time. Again equals to m plus button 10th time. Done now. Then there is MRC button, memory recall. MRC button you press 2.045. Okay. Calculator or this, whichever is comfortable for you. If m plus button is not working for you, either buy one or use this way, whichever you call. For normal one, use GT button. GT button is faster. But if they ask you midway, then use this m plus 1 button. Done, Sarji? Everyone got it? Okay, 11 to 15 Chapandi pa. Now you tell me. 11 to 15. Oh, no. Maybe I'll tell you over here. 11 to 15, what is the maintenance cost? 39,000. Different every year or same every year? Same. Now find PVAF from year 11 to year 15. What you will do first? Press 1 divided by 1.1 to 10 times first. 10 times first. 1.161, correct. 1 divided by 1.12, press equals to button 10 times. From 11th time onwards, press equals to button and m plus button together. Equals to m plus, equals to m plus, equals to m plus, like this, till 15. And then press MRC button. What are you getting? 1.161. Everybody is getting this. You want me to show this once or sorted? Everyone, pakka. So that is your PVAF. So mid-year, if you want to get PVAF, you can calculate like this. Now last to salvage value. How much is salvage value we got? 64. Salvage value you will get every year or once. That to end of the year, which is the year ending. 15th year. Now Guruve PVAF or PVIF? At 12% PVIF. 1 divided by 1.12, press equals to button 15 times. 0.18. Multiply and you will get the present value. You will get the NPV or present value of cash outflows. Present value of cash outflows. Because all these are what? Only outflows. Life was same or different? Life was same or different? Different. So we have to find what? EAC. We already did this. Tell me EAC. NPV alla guruve. Outflow. You want to leave now? Outflow. Present value of cash outflow divided by PVAF. That will give you your EAC. Now Prove don't use M plus button. We need PVAF for what? Full 15 years. Okay, calculate. Full 15 years go give me PVAF. 1 to 15 years go give me PVAF. 1 divided by 1.12, press equals to button 15 times and then GT button. 6.81. Okay, now. Today calculator will be gone. The amount of Josh you are pressing. Probably you are putting all my Rosha Copa on that calculator. Okay, what is EAC, people? Present value of cash outflow, which is 7,62,927 divided by PVAF. If you do, you will get 1,12,014. Done now. Same drama you will have to do it for ABC also. I'll just discuss the method. Would that be okay with you? But ABC ka year is not 15 years. It is only 10 years. Okay. So same time, these two are what? Outflows. Here outflows we are presenting as positive number. Salvage value is negative because they've given a lot of outflows. In fact, all these three are outflows. Check if you want, they've taken 450, 31, 53. 450, 31, 53. All outflows positive. Salvage value, how much did we get for second asset, people? 57,000. They have taken this as negative. And you already know for year 6 to 10 how to find out PVAF. Done now. This is what? Present value of cash outflow. But this life is only 10 years. Previous ka was 15 years. Hence first find what? EAC. How do you find EAC? This number divided by PVAF. Prabhu, now don't take this PVAF. Here life was 15 years. Here life is 15 years or 10 years. Calculate 10 years ka PVAF, which is 5.65. This divided by 5.65 will give you EAC. This is option number 2 ka EAC. Once more, sorted. Get numbers you leave, but are you able to understand the process? Remaining ones, if you review, you will get it. Overall, this is good now. One more, that's all. One more option. Lease option. Rent option. Thank you, ma'am. All right. Now, this leasing or renting option, when there is a catch there. What is the catch here? You're not paying the rent at the end of the year. You're paying at the beginning of the year. I'll read that sentence once again for you if you want. So no, sir. Hey, I want to read. Annual rent should be paid. You can take instead of buying ABC. This is only applicable for ABC. Huh? ABC ka life is 1 year or 10 years. 10 years. So instead of buying, you can lease it or rent it for 10 years. Now, if you want to rent or take this ABC on, lease, annual rent shall be paid at the beginning of each year. First year, how much rent you will pay? 1 lakh 2. When you will pay? End of year 1 or year 0? So check year 0, 1 lakh 2 you should take. They take a year 0, 1 lakh 2. Okay, people. Then no, for the next how many years? Next 4 years. That is, you'll write year 2 now. No, you have to pay beginning of the year. So that means from year 1 to year 4. Year 1, year 2, year 3, year 4. How much you will pay? 1,02,500. Correct, people? See, second, when you write, instead of writing year, when you write year 2 in FM, it means end of the second year. Will we pay next rent at the end of second year or beginning of second year? Beginning of second year means it becomes year 1. Hence, the column here will be for rent, it will be first year 0. Then next 4 years will be year 1 to year 4. Okay? Everybody good? And how much is that rent? 1,02,500. Check, have they taken 1,02,500 from year 1 to year 1 to year 4? Where is it? Here. Year 1 to year 4, 1,02,500. Done, people. And next, what did they give? Next 5 years, the final 5 years, the rent will be 1,09,950. Or simple drama is rent you copy. What is it here? 1,09,500. No, this is year 0. This is year 0. Next, they gave how many years ka rent? Year 1, year 2, year 3, year 4. Automatically next will start from year 5 to year 9. So you don't have to break your head. If this stops at year 4 means next will be from year 5 only. Okay, Naji? Different every year or same every year? That means we will use PVIF or PVAF. But here careful, 5 to 9. You know how to find, no? First press equals to button 4 times. From 5th year onwards, equals to button and M plus button. And if you do it, you will get it. Okay, Naji? Correct. But don't take PVAF for 9 years. You're paying rent. No, 1 second. This one solved, no? Yes. What is this? Present value of cash, outflow. Now we have to compare all the 3. First, missionary ka life 15 years. Second ka 10 years. Third option ka 10 years. Life same or different. When it is different, we always have to work based on EAC. How do you get EAC? Here outflow is given. So present value of cash outflow divided by PVAF. Just because your column ended at 9th year, don't take PVAF for 9 years. Take PVAF for 10 years. Because lease ka term is 10 years only. Rent you are paying at the beginning of each year, but lease ka duration is still 10 years. Now, don't take 9 years ka PVAF. After doing so much, don't do that mistake. So take PVAF for how many years? 10 years only. Because total lease ka or rent ka duration is 10 years only. And then calculate EAC. This is a hidden adjustment. Okay, na sir? 1 or 2 good points are there in this question. One is salvage value, finding mid years ka PVAF, and this rent ka putting the right year columns. And considering not taking 9 here, taking 10. These are some small mistakes which can happen. If you sort this out, I think done. Now people, EAC. This is EAC from benefit angle or cost angle. So you will select the one with the highest EAC or lowest. First option ka EAC was 1,12,000. Second ka 115. Third ka 117. Which is the lowest? 1,12,000, no? So first option was at the brand XYZ, no? That is a decision. Since equivalent is leased in case of XYZ, that should be purchased. Okay, now examiner was not satisfied with this. What did they ask? One more. What is it? State the option which is most economical if the machinery is likely to be used for 5 years. Previously, they told we want to use it for 20 years. But anyway, the life was only maximum 15. So we did it at 15, 10 and all. Here now they are saying work out every option when we want to use it only for 5 years. That means you tell after 5 years, any data you will take a cut it off. Cut it off. You have to take the data only from year 1 to year 5. Manageable. Everybody good. Salvage value, this one can you take? No, people, this was a salvage value for 15th year. I mean, same working note you have to put for 5th year. 5th year. Calculate. Calculate. Same. Let's see. Same. Salvage value should be dropped by 1/3 for of purchase price for first year. Thereafter, depreciated for first asset at 4%. Calculate. Let's see. Huh? I don't know. I'll cross check. You tell me. Huh? 3,04,000. 3,04,000 it seems. Here also they've got 3,04,000. Anybody needs help in that or sorted? Pakka no. In fact, if you just need it, here you will take what? You will take depreciation from year 2 to year 15 or year 2 to year 5. Year 2, year 3, year 4, year 5. So you will multiply by 14 years or 4 years. 4 years. That's all. That's the only change. Okay, here also same thing. You will multiply not by 9 years but by 4 years. Rest calculation is same. I hope I don't have to show that. Correct now, people? Now, sir, if everything is on 5 years, I don't need EAC. We are working second option. We are working second case. All the three, we are working for what period? Period. Sir, EAC is required only if period is matching or not matching. In second option, everything we are working at what period? 5. EAC required or not required? Even if you calculate EAC, everything you will divide by PVA for 5 years. Even if you do it, not a problem, but not required. That means you can answer based on present value of cash outflows. Clear? So that I have to show or manageable? Manageable. You can manage pakka. Now, 1 minute. Wait. Lease option, you have to take it for 10 years. Lease option, you have to take it for 10 years. Before 10 years, if you cancel, there is a penalty. Don't forget penalty. So in the next option, you will also get a penalty. How much is the penalty? 1 lakh. They didn't leave it at that. They said each year you use the asset. Each year you continue the lease. Penalty will reduce by 10,000. So that means what is the penalty? Penalty will be 1 lakh. Provided you cancel first year only. Did we cancel first year or 5th year? That means we use the asset for how many years? 5 years. That means penalty will reduce by 50. So penalty will be inflow or outflow. So one more outflow will come for which option? First option purchasing, second option purchasing second asset, third option leasing. This 50,000 will come for leasing. Where is it? Here. Outflow. Done now. So where is salvage value? Hey, this is leased. Lease by where will salvage value come? Other two salvage value will come. Okay, here instead of salvage value, what will come? Penalty will come, but as an outflow. Good question. Doubtful that such a lengthy question will come. In class only we took almost 1 hour to solve this question. More than 1 hour. Okay. But doubtful that easy only. But since you have to work out for so many options, becomes a little lengthy. Overall, I hope it was comfortable for you. Yes, people. Yes, so with this, so finally investment decisions we have put out. Tatastu. Thank you. Let's take breakfast break and resume back. Thank you. Hello, people. Let's continue our revision series. So now we'll be revising dividend decision topic. A small chintu pintu cute topic. Easy topic. 4 to 5 marks expected. Not beyond. Usually not beyond that. Let's use that word usually. Okay. Now, forms of dividend. 1 or 2 theory is there. Again, not that very important. Quickly we'll run by. There are few forms of dividend. One is cash dividend. Cash dividend means dividend is paid in the form of cash. When we say cash, it's not necessarily cash. It could also be a bank transfer. Another one is stock dividend. Stock dividend means giving out bonus shares. If a company issues bonus shares, that is also considered as one form of dividend. Because on bonus shares, company will not collect any money. It is given for free. Okay, that's one. Now, overall or the scope of this topic is dividend decision, guys. Should the company pay dividend or should they not? Will the dividend policy of the company affect the market price of the share? That's all is the scope of this topic. Should the company declare dividend or not? If at all you say declare, how much? So those are the things which we're going to be addressing in this particular topic. Now, few Mahanubahas, Bhavasu, Brahaspatis will come over here. Same like capital structure, we have relevance theory, irrelevance theory. Irrelevance theory का argument is dividend policy is not relevant, meaning whether company declares dividend or whether they don't declare dividend, market value of the firm will be same. So the first person who is arguing for this theory is our sir. Okay, sir has given about couple of formulas here which we need to remember, where P0 means current market price is equal to P1 plus D1 divided by 1 plus cost of equity. P1 plus D1 divided by 1 plus cost of equity. If you do that, you will get P0. It's actually very simple formula. People, you want current market price, no? We've already done previously NPV. How do you get the basically like present value? Take the future value and multiply discount factor. That is what sir is saying. As if you are an equity investor in one company, you may get some dividend in future. And by selling the shares, you may get some money also. So P1 plus D1 you take, but what is this P1? This is the price of the share now or after 1 year? This is the dividend now or after 1 year? I mean, these two are what value? Future value. But we are finding future value or current market price of the share. So take the future value and multiply discount factor, because what is discount factor ka formula? 1 divided by 1 plus I whole power n. We are in first year, no? So n is 1. Instead of I, they substituted with cost of equity. So basically this formula is nothing but future dividend and future price ka multiplied by discount factor, expressed in different way. P0 is equal to P1 plus D1 divided by 1 plus cost of equity. That is 1. And value of the firm denoted by V or VF is equal to N plus delta N into P1 minus investment plus earnings, whole thing divided by 1 plus cost of equity. N here stands for existing number of equity shares. Delta N here stands for number of new equity shares issued. So if you take existing equity shares and add new shares, you will get the total number of shares. Total number of shares multiplied by P1 if you do, you will get the market value. In this portion, some money will be used for investment. Some money has got added in the form of earnings. But all these are current value or future value? Future value. So divided by the discount factor, you will get the current value of the firm. Again, it's a simple calculation. Future value multiplied by the discount factor. Okay. So these are things will apply in problem. Obviously, you have done all this. Correct? No, you must remember this. Okay. Sir, how do you get delta N? Anybody remembers? Delta N is nothing but some extra shares issued. Sir, the company will issue extra shares when they have surplus money or when they need money. When they have shortage and when they need money, they will raise the money by issuing extra equity shares over here. Now, how do you get delta N is, let us say company has an earnings of 1 lakh. Company has how much earnings each? Let's say company has a each of how much? 1 lakh. In this 1 lakh, company is planning to give 20,000 as dividend. 20,000 will be utilized for equity dividend. How much money remains? 80,000. Okay now. But now company wants to start a new project for which how much fund is required? 4 lakh is required. All numbers are assumed. Okay. We have how much? 80. We need how much for future project? 4 lakh. So we have surplus or we have shortage? How much shortage? 3,20,000. If you have shortage, means we have to raise it by issuing new equity shares. By issuing new equity shares, how much money you want to raise? 3,20,000. This is nothing but your shortage, and delta N is nothing but number of shares issued. Are you issuing the shares immediately or in future? So hence take 3,20,000 divided by P1 you do. P1 means price now or after 1 year? After 1 year. So that way you will get the number of shares issued. Clear, Sarji? This is how we find out the delta N wala portion. To find the value of the firm, take N and delta N, add them together, multiplied by P1 minus investment plus earnings. Whole thing divided by 1 plus cost of equity. Now, since sir is an irrelevance theory, whether company pays a dividend or whether company does not pay dividend, value of the firm will change or value of the firm will be same. Value of the firm will remain same. Okay, people, this is one type of question which is expected from this chapter under approach. Same under approach, sometimes they will also say, they will not say calculate value of the firm. They will say calculate market value of shares. They will say calculate market value of equity shares. If you only use this portion, you will get market value of equity shares. Because N plus delta N is what? N is what? Existing shares. Delta N is new shares. If you add this, what are you going to get? Total shares. Total shares multiplied by market value of one share if you do, what are you going to get? Total market value. So that is also another thing that they can ask in this particular problem. Okay, people. Now, this is also same. Whether company declares dividend or they don't declare dividend, value of the share should change or it should be same. Value of the firm as well as market value of the share should be same. If you are getting a different value, you have done some calculation wrong. We will do one question on this just to be on the safer side. Can I move on to the next? Next, we have some relevance theory. Under relevance theory, we have Walter Serro, Gordon Serro. Walter Serro, anybody remembers formula? How do you get the price of the share as per Walter Serro? D plus R into E minus D divided by cost of equity, whole thing divided by cost of equity. D for dividend per share. R is the rate of return on investment divided by cost of equity. E here is your EPS, whole thing again divided by cost of equity. Okay, I had explained you the logic of all this formula, people. Now I'll not go into that. People just will remember the formulas and move on with it. That's enough for the time being. Okay, so now this is one. All the components are fine. Okay, Gordon Serro, any which way we know the formula. It is just rephrased in a different way. Remember, in cost of equity, what was Gordon Chachaka formula we used? D naught into 1 plus growth rate divided by KE minus G. This was the formula we used to use. Correct na, people? Or rather ulta, I think we used to use this. If you want to find cost of equity, so D naught into 1 plus growth rate divided by P naught. Flotation cost will not be there over here, since I've cut off. Whole thing added by the growth rate. Now this will be given, this will be given, this will be given, as well as this will be given. What will be missing? P naught. So can you rephrase the same equation to find P naught? Yeah, growth rate, you send it to the other side. Okay, KE minus G. P you send it here and KE minus G you send it here. So what will be the formula? D naught into 1 plus growth rate divided by KE minus G. New formula or same thing? Same wine in the new bottle. Okay. Instead of D1, if you do D naught into 1 plus growth rate, what are you going to get? D1. If they give D naught in the problem, use D naught. If they give D1 in the problem, use D1. So how do you get another formula for current market price? Instead of D naught into 1 plus growth rate, you will directly take D1 divided by K minus G. Any problem, sir? Now one more is there called where price of the share is given by E1 into 1 minus B divided by K minus BR. This is a pure substitute. First of all, E here is what? EPS. B here is what? Retention ratio. First maybe we'll do the denominator. Here what is the denominator? K minus G. Here what is the denominator? K minus BR. How do you find growth rate? B into R. So G is substituted with BR. Okay, na sir. So that means denominator is same. E is EPS. E is EPS. B is what? Retention ratio. Now people, if B, that is retention ratio, is 70%, means can you tell me what is a dividend payout ratio? If 70% of EPS, B retention ratio is expressed on EPS, people. So 70% of what? EPS. So if 70% of EPS, if you are retaining, means how much is your dividend payout ratio? 30% of what? EPS. Okay, Naji. Now, people, if I do 1 minus B, what am I going to get? Check. B is how much here? 0.7. 1 minus 0.7, if you do, what are you going to get? 0.3 or nothing but what? 30%. What is that 30%? Dividend payout ratio. So that means when you do E into 1 minus B, what does 1 minus B give you? 1 minus B will give you dividend payout ratio. If you take expected earnings and multiply dividend payout ratio, what are you going to get? Dividend paid or dividend expected to be paid? That means by doing this, automatically you will get what? D1. That means all these are different formulas or same thing? Same things expressed in different way. Okay. If they give you growth rate and all directly, we will use one of these formula. If they give you B, if they give you R, then we will go for this particular formula. Comfortable, everybody? So all the three are same. It's just a pure substitute. One substituted with the other. But you need to remember all and use whatever information as given in the question. Depending on that, we'll have to use one of these formulas. Need a minute or okay? Comfortable, everybody? Okay. So let's move on to next one. So remember, Gordon sir and Walter sir had some optimum payout ratio. Anybody remembers that? Optimum. As per Gordon sir and Walter sir, there is an optimum. Same optimum dividend payout ratio. Optimum means ideal. So Walter sir and Gordon sir says, if R is greater than cost of equity, if R is greater than cost of equity, suppose R is a rate of return on your investment. Whatever project company is doing, on that they will expect some return. Let us say return is 50%. But in order to do the project, company should raise funds. Funds will have a cost. Funds will have a cost. So if you are raising equity shares and the cost is, let's say, 10%. Now you would tell me, this is a profitable project or loss making? Sir, if your fund is costing only 10%, using the fund you are generating a return which is how much? 15%. So it's a profitable project, no? If you are running a profitable project, that means what? You'll distribute more dividend or you like to distribute less? Now think, if a company is doing a profitable business, would they like to do it at limited scale or go on expanding? Because if it's a profitable project, means more and more you do, company will get more and more profit, and the value of the firm will go on increasing. So hence Walter sir and Gordon sir says is, if R is greater than cost of equity, then you are running what sort of a project? Profitable project. So ideally dividend payout ratio should be 0. This is ideal. Company may follow ideal or company may follow something else. That is their choice. This is the ideal. Optimum means ideal benchmark ratio suggested by Walter sir and Gordon sir. If R is greater than cost of equity, optimum dividend payout ratio should be 0. If it's the other way around, if return from the project is lesser than the cost of equity, then profitable or loss making. Return, let's say, is 15%, cost is, let's say, 18%. Then it costs 18% to arrange the fund. From that fund, you are generating a return of only 15. So profitable or loss making? We are not making that much, yes or no. In that case, my optimum dividend payout ratio should be 100%. Don't continue this project. If at all you have any money, distribute it as dividend. How much? 100%. If R is exactly equal to cost of equity, return and cost, if both are same, then there is no optimum dividend payout ratio, or whatever you pay, everything is optimum. Share price will not change. I'll prove it to you with one of the problems. If these two are same, means there is no optimum, or whatever you pay, everything is optimum. You can pay 5%, 10%, 80%, 100%, 0%, doesn't matter. Share price will be same. This is about optimum dividend payout ratio as per Walter sir as well as Gordon sir. Same thing. This is a popular question. Usually they do ask this. Optimum dividend payout ratio. Then Graham and Dodd model, where price of the share is given by the formula M into E plus or D plus E divided by 3. M is your multiplier, D is your dividend per share, E is your earnings per share. Okay, people, again, a simple, they've done it all, but one good thing is they'll give you all the data. Just dump it and get it. All these are 1 marker or 2 marker wala question, not beyond that. Okay. All right. Then no linter the splinter. What does linter sir say? Anybody remember? No sir, we learnt it sir, we forgot it sir, then and there only we left sir. Okay, linter sir is trying to say, linter sir is not giving price of the share. Linter sir's model only gives you D1. D1 means, first of all, D0 means what? Dividend paid. D1 means expected dividend. So linter sir has come out with a formula to calculate expected dividend, where expected dividend D1 is equal to D0 plus, open the bracket, EPS into target payout ratio minus D0, whole thing multiplied by adjustment factor or speed of adjustment, they say. This is a formula. Actually, it's a very simple faltu wala formula. Chuma, they have given too much build up. What is this simple thing is? According to Linter sir survey, Linter sir did a survey with many finance manager. What is the outcome of that survey is? Linter sir's discovery was, managers are okay to pay same level of dividend. What did I say? Managers are fine with paying what? Same level of dividend. Meaning last year if they paid dividend of 15 rupees, current year also they are fine with paying 15 rupees. But managers are hesitant to increase the dividend. Finance managers are hesitant. They are not that comfortable in increasing the dividend. That's what Winter sir found when he did survey among the managers. So how did this formula work out is, let us say, last year, I think I've used this example. Last year, company has paid a dividend. Company has already paid how much dividend? 10 rupees. Now people, this year, company is targeting to pay 60% of EPS as dividend. Once more, what is that? Dividend already paid how much? 10 rupees. This year company wants to pay how much as dividend? Earnings ka 60%. How much ever is the expected earnings? How much ever future earnings will be there? 60% of that company is planning to pay dividend. How much is the future earnings I've assumed? Future EPS, how much I've assumed? 20. How much dividend company wants to give? 60%. 20 ka 60% is how much? 12. Correct? Huh? Sir, last year how much? 10. This year looks like how much? 12. That means, is there any, compared to last year, is there any increase in dividend? Last year 10, this year 12 means how much is the increase in dividend? 2 rupees. 2 rupees. Find out this increase in amount and multiply AF. Find out the increase in dividend and multiply AF. AF means what? Probability factor. AF ka full form is adjustment factor. If AF is 40% means what we are trying to say is there is a 40% chance. There is a 40% chance or 40% probability that dividend will increase by 2 rupees. Chumma, I could have made it very simple now. Take increase in dividend and multiply probability percentage. That way you will get increase in dividend. To that you add existing dividend, you will get the new dividend. Chumma, I could have made a formula very, very simple. Increase in dividend multiplied by probability percentage plus D naught. But instead of all that, what is the formula? D naught plus EPS into target payout minus D naught into adjustment factor. Sir, if you do EPS into target payout ratio, what are you going to get? Expected D1. From D1, if you minus D naught, what are you going to get? Increase in dividend. There is 100% probability that increase will happen or lesser. Lesser. That is what is denoted by adjustment factor. By doing all this, you will get the totally how much dividend will increase in the current year. To this, you add your existing dividend. Finally, you will get what? D1. That's all this is formula all about. Okay, sir. Need a minute? Okay, now. Everybody cool? Okay, dividend discount model, I'll directly take you through with a question itself. One question we will solve and explain you this. If you want, I'll come back to this formula after I solve the question. Without formula also, you can solve this particular model. And now, I think that's all as a concept relating to dividend discounts. 3-4 formulas, that's pretty much it. Once again, all the formulas, call it out back for me. First, we have theories. What are those theories though? Relevance theory, irrelevance theory. Under irrelevance theory, we have Sir. Sir, mein, how do you get P naught? P1 plus D1 divided by 1 plus cost of equity. Then, how do you get the shortage of funds? From the earnings, reduce dividend. You will get amount available for investment. Compare that with amount required for investment. You will get the shortage. Shortage means you have to raise the funds. So shortage divided by P1 if you do, you will get the number of new shares issued, which only we call it as delta N. How do you get value of the firm? V N plus delta N into P1 minus investment plus earnings. Whole thing divided by 1 plus cost of equity. And if they ask you only market value of equity shares, then it will be N plus delta N into P1. Whether dividend is paid or whether dividend is not paid, value of the firm and market value of equity shares will be same. That's the Sir argument. Next is relevant theory. Relevance theory mein we have Gordon and Walter Sir. Under Walter Sir, what is the formula to find out the current market price? P naught is equal to D plus R into E minus D divided by cost of equity. Whole thing again divided by cost of equity. Then Gordon's Chachaka same thing, but in a revised format where price of the share is given by D naught into 1 plus growth rate divided by K minus G. Or if they give D1, P naught is equal to D1 divided by K minus G. Or another one, P naught is equal to E1 into 1 minus B. If you do that, automatically you will get D1 divided by K minus, instead of G, we will write K minus BR. It's a pure substitute. Walter Sir, Gordon Sir's optimum dividend payout ratio same. What is that? If R is greater than cost of equity, optimum dividend payout ratio should be 0. If R is lesser than cost of equity, optimum dividend payout ratio should be 100%. If R is exactly equal to cost of equity, then there is no optimum, or whatever you pay, everything is optimum. Price of the share will remain same. Then Graham and Dodd model, where price of the share is given by M as in multiplier into D plus E divided by 3. M for multiplier, D for dividend per share, E for earnings per share. Then Linter-Sir's model, Linter-Sir's only gives you the D1 ka calculation, where D1 is equal to what? D naught you take plus EPS into target payout minus D naught. By doing this, you will get increase in dividend. 100% chance into adjustment factor, that is a probability percentage. That will give you your expected dividend D1 as per the Linter's model. I think that's pretty much it. That's what, this one, it's still pending. We'll take care of it in the problems. Okay. Now, can we apply a few questions to learn this? It's a simple, only these are the formulas. If you know, the whole chapter sorted. Now, we'll do one question on everything just to kind of retrace that formula and then we'll wind up. Question number 1. Again, there's a study material question. I've taken this question and explained all the concepts or all the types of adjustment that can come through approach. AB engineering belongs to a risk class where capitalization rate is 10%. Capitalization rate means here they're saying cost of equity is 10% because here funds we will raise through equity shares. Whenever we have fund required, no, we are not raising the debt. We'll raise the funds through equity shares. Hence here capitalization rate refers to cost of equity. It currently has outstanding how many shares? Sir, existing shares only we denoted by the symbol N. And which is selling at 100. Currently it is selling at 100 means what is current market price of the share? 100. That only is what? P naught. The firm is contemplating, as in thinking, declaration of dividend of 5 rupees per share. Dividend already paid or dividend thinking? Contemplating means thinking to pay. So this is what? Dividend paid or expected? Expected dividend is D naught or D1? D1. So D1 they have given it to be how much? 5 rupees per share at the end of current financial year. It expects to have a net income of 1 lakh. Net income means PAT basically. But here preference shares will not be there. So PAT and niche will be same. It has a proposal for making a new investment, but the new investment will cost how much? 2 lakh. You need to calculate the value of the firm under two scenarios, when the dividends are paid, when the dividends are not paid. Now people, whether dividend are, since is an irrelevance theory, under both the case, value of the firm should be same. That's our, that's our final goal. So let's calculate. First formula, how do you get P naught? P1 plus D1 divided by 1 plus cost of equity. Now you tell me, first we'll solve this case. Dividends not paid. So what's that formula again? P naught is equal to P1 plus D1 divided by 1 plus cost of equity. P naught is known. D1 we're solving which case? Dividend not paid. So D1 is 0. Cost of equity given 10%. So which is a missing figure? P1. This formula is used to find out P1. So substitute to get the answer. That's what we have done here. Working note number 1 is to find out the P1, where P naught is equal to P1 plus D1 divided by 1 plus cost of equity. Current market price is P naught. It is given in the question as 100. P1 we don't know. So D1 is 5 rupees. No. Which case are we solving? Dividend not paid. Dividend not paid means dividend will become 0. Cost of equity they gave in the question. Check people, how much was that cost of equity? 10%. 10% and full number will become 0.1. When you solve, you will get P1 to be 110. Any issues with this? Okay, na Sarji. And next we have to find out delta N. Delta N means new shares issue. Sir, we will issue new shares when we have surplus or shortage. Shortage of money. How do we find shortage of money? First, how much is that net income they gave in the question? 1 lakh. Net income means PAT. How much is PAT? 1 lakh. Okay. From this PAT, since there is no preference dividend, PAT only will become ish. Reduce the equity dividend. Which case are we solving? Dividend not paid. So that means the dividend amount paid will be 0. So how much amount is available for investment? 1 lakh. But do we need 1 lakh? How much money is required for investment? The amount required for investment is 2 lakh. We need a 2 lakh, but we have only 1 lakh. How much shortage? 1 lakh. Yes, sir, people. If we have shortage, what are we going to do? Issue the shares. You have to issue new shares in such a way that totally how much will recover? 1 lakh. And what is the expected price of one equity shares? P1 we got 110. This is a shortage we'll get in future. So we'll use P1. So 1 lakh divided by 110 if you do, you will get the new shares issued, which we call it as delta N. Okay, na sir? Don't solve this. Only if they ask in the problem, calculate number of new equity shares. Calculate number of new equity shares. Solve this. When you solve this, what are you going to get? 90. Always round off to the next number. Whether it is 0.5 or less than 0.5. Not mathematical round off. Any decimal you round off to next number. So it will be 90. What are you getting? 90? One of you. 90. 909.09. Take it as 910. You always round off to the next number, not mathematical round off. Just put it off to the next number. So how many shares? 910 shares. Sir, you will do this only if the question asks you to find what? Number of new shares. Otherwise, don't put it in decimals. Keep it in fraction only. It will get nullified in the next step. So keep the fraction. Okay, but did they ask you this or they asked value of the firm? Sir, how do you get value of the firm? N plus delta N into P1 minus investment plus earnings, whole thing divided by 1 plus cost of equity. N is the existing number of shares. How much existing shares we have? 10,000. Okay, updated. Plus delta N. Delta N we just now got it as 1 lakh divided by 110. Multiplied by P1. P1 is how much? From working note number 1 we got 110. Minus investment. How much money we need for investment? 2 lakh. Plus earnings. How much earnings we have? 1 lakh. Whole thing divided by 1 plus cost of equity. Now why did I ask you to keep fraction is? 10,000 into 110 is how much? 10,000 into 110 is how much? 11 lakh. Now 1 lakh divided by 110 into 110, if you do this 110, this 110 will get cancelled. So what will remain? 1 lakh. That way you don't have to solve the decimal, keep the fraction. Minus investment 2 lakh plus earnings 1 lakh divided by 1.1, if you do, you'll get the value of the firm to be 10 lakh rupees. Easy na Sarji? This is value of the firm. By chance, if they don't ask value of the firm, if they ask you market value of equity shares, here not asked, by chance, what you will do? Yeah. N plus only this portion of the formula, N plus delta N into P1. What is N? 10,000. What is delta N? 1 lakh divided by 110 multiplied by P1. If you do, you will get how much? 12 lakh. This is another way of asking the same. One more requirement they can ask from MM. I've just solved it just for our reference. Now all this we solved under which case? When the dividends are not paid. Now same thing we'll have to solve when the dividends are paid. And how much is the company planning to pay dividend? 5 rupees. Okay, so let's solve that. This is a dividend paid wala case where P0 is equal to P1 plus D1 divided by 1 plus cost of equity. Current market price P0 is given. How much is that? 100. P1 we don't know. How much is dividend per share? Expected dividend per share D1 is how much in this problem? 5 rupees. This is dividend paid wala case, okay? And the company is thinking to pay a dividend of 5 rupees. So it is D1. Divided by 1 plus cost of equity. Solve. How much are you going to get? 105. Any problem? Now, next case, delta N. How do you get delta N again, people? Walk me through. First to earnings. How much is the earnings we have? 1 lakh. This is your PAT. Preference dividend not there. But is company planning to give dividend? Yeah. How much dividend? 5 rupees per share. How many shares we have? Currently we have how many shares? 10,000. On 1 share 5 rupee dividend. On 10,000 shares how much dividend? 50,000. So in 1 lakh totally 50,000 will be utilized for equity dividend. So how much remains? 1 lakh minus 50. Remaining amount is only 50. But how much we need for investment? We need 2 lakh, we have only 50. How much shortage? 1 lakh 50. If you have shortage, we have to raise new equity shares. That only we're calling it as delta N. How much is delta N here? Shortage divided by P1. 1 lakh 50,000 divided by P1, which is 105. Solve the decimal or keep the fraction. If they ask value of the firm, keep the fraction. Sometimes they will say find out number of new equity shares. In that case, solve it and take it to the next number you round off to. Next, value of the firm given by the formula N plus delta N into P1 minus investment plus earning. Whole thing divided by 1 plus cost of equity. N is the existing number of shares, which is 10,000. Delta N is this, which we have copied. P1 is 105 minus investment is 2 lakh. Earnings is 1 lakh. Whole thing you do, you'll get the answer. So when you solve it, do you think you should get a different answer? It's the same answer. Here you got 10 lakh means here also you should get 10 lakh. If you get a different answer, somewhere you have done something wrong. So don't proceed, correct the error. Done, Sarji. What about market value of equity shares? If they ask that, what you'll do? Only this. Solve that for me and quickly tell. only this portion of the formula, n plus delta n into P1. If you do it, how much are you getting? 12 lakh. Previously, what did you get? 12 lakh. Different number or same number? So that's what I said. Value of the firm as well as market value of equity shares. Whether you pay dividend or we don't pay dividend. Answer should be same. These are the ways through which, or these are the things that they can ask from approach in the dividend decision topic. Beyond that, I don't think so you'll get anything. Whatever we have solved, that's a maximum scope of approach in dividend decision. Need a minute or next? Next. Easy only, no, all these are faltu problems. Next, you need to calculate using Gordon Search model. Check following figures, again study material question. Following figures are collected from the annual report to net profit. People, net profit always means PAT. How much is PAT given? 30 lakh. But here we do have preference shares. Keep in mind, how much is preference shares? 100 lakh. What is this 12%? Rate of dividend on preference shares. Number of equity shares, how much? 3 lakh. Rate of return on investment, which is nothing but R. How much? 20%. Cost of capital, cost of equity is given to be 16%. Now, you need to calculate price of the share using Gordon's model. Is growth rate given? No. But R is given. And dividend payout ratio is given 25%. So 25% you're paying means how much you're retaining? 75%. What you're retaining only we call it as B, no? Correct, no? So if D is 25% of EPS means B will be 75%. One case or three case? First, when dividend is 25%. Second, when dividend is 50%. And then dividend is 100%. Tell me what will be B in each case? 25% if you're paying means how much are you retaining? 75%. 50% if you're paying means how much you're retaining? Balance 50%. 100% if you're giving dividend means how much you're retaining? 0. Okay, na sir? So B you have. Which formula of Gordon uses B? What is that formula? A price of the share. Price of the share is given by the formula E1 into 1 minus B divided by K minus BR. You have to use this particular formula and update the things. Can we do it? Pure substitute. But 1 second, E here stands for EPS. EPS given, No, what have they given? PAT. How do you get EPS, people? PAT divided by number of equity shares or EASH? How do you get EASH from PAT? From PAT, first you reduce preference dividend. So first working note is to find out EPS. From PAT, you reduce preference dividend, you will get EASH. EASH divided by number of equity shares will give you EPS. Correct? If you want to calculate, we'll cross check. 100 lakh ka 12%. So preference dividend is 12 lakh. From 30 lakh, you reduce 12 lakh, you will get 18 lakh. Number of equity shares is 3 lakh. 18 lakh divided by 3 lakh is 6 rupees. That is the earnings per share. Easy. Any problem? No. First case mein dividend payout ratio how much? 25%. Sir, if dividend payout ratio is 25% means B is 75% or 0.75. So use that formula E1 into 1 minus B divided by K minus BR. E we just now got how much? 6 rupees into 1 minus B. B is how much? Since D is 25%, B is 75% or 0.75. Substitute. K they only have given. B we got. R they have only given. How much is R they have given, people? R is 20%. Substitute and you will get the answer. How much is that answer, pa? Where it went? The answer is 150. That's what we're getting. Done, sir. Now, next case, only one data has changed. From 25% dividend payout ratio, it has become 50%. Should I have to take you through this or got it? This is the same, no? If dividend payout ratio is 50% means retention ratio also will be 50% or 0.5. Now, substitute this number and get the answer. Okay. Last is dividend payout ratio 100%. So, B will be, we are not retaining anything. So, B will be 0. Substitute and get the answer. Process or next? Okay. Looks like you have decided that you will go early today. Okay, fine. No issues. This is one good adjustment. Wala question. Check this. Total earnings is how much? 2 lakh. Total number of equity shares is 20,000. Sir, total earnings is 2 lakh and total number of shares is 20,000 means what is earnings per share? 2 lakh is earnings for 1 share or 20,000 shares? For 1 share, how much? 2 lakh divided by 20,000, which is 10 rupees. EPS is 10 rupees. Okay. How much is the dividend paid? Sir, in all our formula, we don't need total dividend. We need dividend per share. Total dividend is 1,50,000 on how many shares? 20,000 shares. On 1 share, how much is the dividend? 1,50,000 divided by 20, which is 7.5. That is the dividend per share or DPS. Price earning ratio is 12.5. Price earning ratio is nothing but your P multiple. Correct, people? 1 minute, hang on. Tell me P multiple ka formula. MPS divided by EPS. Correct. Now, people, if you remember, when we did cost of equity, there was dividend price approach. In dividend price approach, how did you get the cost of equity? Name only, there was formula. Dividend price approach. Dividend divided by price. DPS by MPS. Next, there was earnings price approach. What was earning price approach? EPS by MPS. Correct. Everyone check. This is EPS by MPS. P multiple is MPS by EPS. That means, is there any relationship between these two? Na? Same ulta na? Therefore, I can say what, sir? Therefore, I can say, can I say cost of equity is 1 divided by P multiple? Formula is ulta, no? Correct, everybody? So, therefore, cost of equity is what? 1 divided by P multiple. So, if they have given P multiple means using this, we can also find cost of equity. So, 1 divided by 12.5 you do. How much is that? 1 divided by 12.5 if you do, you will get 0.08 or 8%. That is what cost of equity. Done, Sarji. Now, what is the requirement of the question? Apply Walter's model. Stop. What is Walter's model? D. D is dividend per share. We have got plus R into E minus D. E is EPS. D is dividend per share. We have got divided by cost of equity. We have got whole thing again divided by cost of equity. All data we have except R. If you find R, problem is solved. Agreed? R is also given. Can you tell me? Can you just check and tell me? R is also given in the question indirectly. Or we can find it. They have given enough data. R is a return on investment. R is a return on investment. Here we have only equity share capital. We can't use, you're right, we can't use rows, but return on, very simple, sir. How much is your equity share capital? Can you tell me? Number of equity shares is 20,000. Each ka face value 100. So therefore, what is equity share capital? 20 lakh, no? Agreed. So how much money have you raised from equity shareholders? 20. Using the money only you have generated earnings, no? How much earnings have you generated? 2 lakh. Using 20 lakh capital. Using 20 lakh capital, how much return have you generated? 2 lakh. How much is that return? 10%. No, 20 lakh ka 10% is how much? 2 lakh. That only we call it as R. You must have done in your ratio. No, return on equity. There's nothing but your PAT divided by equity. Actually, it is each divided by equity. This is what we used to use. That's all it is. Or you can simply look at it and get it. Total equity share capital 20 lakh. Total earnings is 2 lakh. That means you have generated a return of 10%. Because 20 lakh ka 10% if you do, automatically you will get what? 2 lakh rupees. Easy na, sir? So R is there. R is how much here? 10%. That's what we've just calculated here. That is nothing but your return on equity. Formula is each divided by equity into 100. How much is each? 2 lakh. Divided by equity. Equity here refers to equity share capital and reserves and surplus. Reserves and surplus there are. No, that means what is equity share capital? 20 lakh. How much return did you generate? 2 lakh. So what is that percentage? 10%. So all the data for Walter Sirs we have got. Need a minute or okay. First I've calculated EPS. Then I've calculated dividend per share. Then using P multiple we calculated cost of equity. Then we calculated R. Now can we read the requirement of this question? Need some time or okay? Alright. Next, read, analyze whether the company is following optimal dividend policy. Sir, 1 second. Walter Sirs and Gordon Sir have both same optimum dividend payout ratio. What is that? If R is greater than cost of equity, optimum dividend payout ratio, 0. Here R, how much we got? 10%. Cost of equity, how much we got? 8%. R is 10%, cost of equity is 8%. So what is this? R is greater than cost of equity. So optimum dividend payout ratio should be 0. Optimum dividend payout ratio 0 means company should pay the dividend or they should not. They should not. But here company did pay the dividend. Company has already paid the dividend, and then now they are asking, is company following optimum dividend payout policy or not? Are they following or not following? So that's what you need to justify. Since R is greater than cost of equity, optimum dividend payout ratio should be 0. That means the dividend should not be paid. But however, this company is paying dividend. So optimum dividend payout ratio as per Walter Sirs and Gordon Sir is followed or not followed? It's a theory question. That's all. And don't write one way not followed. Justify. And this is important. You need to write little masala you need to put. We are Indians, no? Just like that we can't accept. Little thadka if you put only, then only fun. No? Maja. Next, compute P ratio. Compute P ratio when the dividend policy will have no effect on the value of the share. Read this line once again. Compute the P multiple. Compute the P multiple when the dividend policy will have no effect on the value of the share. Meaning whether we pay 0% dividend or whether we pay 100% of the dividend, value of the share should change or it should not change. When will this happen? Sir, we discussed when R is exactly equal to cost of equity, then there is no optimum dividend payout ratio, or whatever you pay, everything is optimum, and the price of the share will fluctuate or it will not. It will not. So that means when this scenario will hold good. For you to have no impact on the value of the share, R should be exactly equal to cost of equity. Now stop. R is how much in this problem? 10%. Cost of equity, how much is in this problem? 8%. Which should we keep it as a base? R is 10 and cost of equity is 8. What should we make it? Should we say R should be equal to K is equal to 8%? Or should we say R is equal to, is cost of equity is equal to 10%? What we should say? R is equal to cost of equity equal to 10%. Pakka na? Why? Perfect. Sir, in cost of equity we have studied. Cost is nothing but return expected by the providers of finance. Today if you are expecting 10%, tomorrow you will expect 10 only, or your expectation may change. Your expectation may change. Before marathon you thought it will be wonderful. After attending class only you are getting a yo full blade. Yes, no, same. Like that only. Yeah? Expectations can change. So cost of equity and all can change. But R is an achieved number. R is a actual number. So which one will you freeze? Cost of equity you will freeze or R you will freeze? R. R is how much? 10%. So you will write what here? When R is equal to cost of equity is equal to 10%. You will not use cost of equity. Which one you will freeze? R. Done. Na? Everybody good up. They ask cost of equity or they ask P multiple. And we already know between cost P ratio and cost of equity there is same relationship or inverse relationship. So that means how do you find P multiple? 1 divided by cost of equity. 1 divided by 0.1, how much is that? 10 times. These are ulta relationship. If you want to find cost of equity, what you will write? If you want to find cost of equity from P, what you will write? 1 or where it went. If you want to find cost of equity, we will write 1 divided by P multiple. If you want to find P multiple, we will write 1 divided by cost of equity. Whatever you want to find, substitute the other number in the denominator. Okay, na Sarji? So if P multiple is 10 times, you can pay whatever dividend, share price will be same. Just for your knowledge sake, we've just proved this to you. I have taken 2 cases. You can build 101 cases, your call. Let's assume dividend payout ratio is 2%. Sir, as per this rule, what is this rule again? Tell me. Since R and cost of equity both are same, there is no optimum. Or whatever you pay is optimum, share price will fluctuate or same. Okay, now let's try to prove this. Dividend payout ratio, I've assumed it to be 2%. You can take any percentage. Sir, payout ratio is always expressed on EPS. How much percentage of EPS is dividend, I've assumed? 2%. What is your EPS, people? You already calculated. How much is EPS? 10. 10 cut 2% you calculate. How much is that? 0.2. So why you took 2%? Some student in Burhaspati suggested 2%. So I took 2. Since it is all this from class notes, so now I can't change. Okay, na? You can take any number. So 10 is EPS. EPS ka 2% is how much? 0.2. Okay, na ji? This is your D. Now substitute this in our Walter-Suss model. Walter-Suss formula is PD plus R into E minus D divided by cost of equity. Whole thing divided by cost of equity. Dividend we got how much? 0.2. R and cost of equity is same. How much is that? 10%, which is 0.1. This is 0.1, 0.1 into E minus D. E is how much? EPS 10. D is 0.2. Solve. How much are you getting? 100 rupees. Huh? If you want, you can prove it for yourself. Okay, sir. Shapa. I know, Shapa. Now, can we assume another one? Let's assume dividend payout ratio is 30% now. 30% of what? EPS. How much is EPS? 10 rupees. Now I've assumed 30% of EPS is given as dividend. Will the price should change or still it should be 100? R is equal to cost of equity. So price should not change. So let's see at 30% are we getting same answer or not? E is 10 rupees. 10 ka 30% is how much? 3 rupees. So dividend now will become 3 rupees. Plug in this number in formula. D, which is 3, plus R divided by cost of equity. Both are 10%. Into E minus D. E is how much? 10 rupees. D is 3 rupees. Solve. How much are you getting? 10 rupees. So that means whatever is your dividend payout ratio, price will always be 100. This scenario will hold good only when what? R is equal to cost of equity. This you don't have to prove it in exam, people. Okay, just for our reference sake, we've just put it up. Second requirement also done. Can we now go through the third requirement? What else they ask? What is your decision if P multiple is 8 instead of 12.5? Here they gave 12.5, no? Now they said instead of 12.5, make it as 8. Faltu, no? Sir, if P multiple is 8 means what will be cost of equity? 1 divided by P multiple. 1 divided by 8. How much is that? 12.5 will be your cost of equity. What is R? R is still 10%. Now you check. R is 10. Cost of equity is 12.5. R is greater than cost of equity or lesser? What is optimum dividend payout ratio? 100%. 100%. So that's what you need to say. And if you want also, you can solve. What will be the price of the share if optimum dividend payout ratio is followed? Dividend payout ratio should be how much? 100% of EPS. How much is EPS? 10 rupees. 100 ka 100% of 10 is how much? 10 rupees only. So dividend will become 10 rupees. R is 10%. Cost of equity is 12.5% into E. E is your 10 rupees. Dividend is also 10 rupees. Divided by cost of equity, if you do, you will get the answer to be 80 rupees. This is the optional. If you want to do, you can, or you can stop it at the theory level only. Since R is lesser than cost of equity, optimum dividend payout ratio should be 100%. Leave there or also do the price calculation also, your call. Done, Sirji? Yes, sir. Okay, sir. Now, one last question and chapter over. Can we review? Pakka over, God promise. You're looking at me differently. Pakka. That's it, over. Nothing else. Now, you remember dividend discount model. It was there in the chart book. This fancy formula. Right? Okay. Now, dividend discount model is not tested since many attempts, people. So, till it is tested, it will always be there as an LDR for me. LDR means last day revision. Better to review that. My gut feel is next 1 or 2 attempts, it will come. This attempt only. Tatastu, it will come. 5 marks question. Okay, now. And now, people, dividend discount model, or they will say, find out the intrinsic value of the share. Find out the intrinsic value of the share, they will say, or they will say, use the word dividend discount model. Here, under dividend discount model, if you want to find the price of the share, that's given by the formula D1 divided by 1 plus cost of equity whole power 1 plus D2 divided by 1 plus cost of equity whole power 2 plus D3 divided by 1 plus cost of equity whole power 3 plus D4 divided by 1 plus cost of equity whole power 4 plus so D5 divided by cost of equity minus growth rate into 1 plus cost of equity whole power 4. This is the formula. Yeah. But you don't have to remember this. You don't need this. Without formula, we will solve. Okay, Naji? Okay, and I prefer to solve this particular model without formula only. Why? Because my gut feel is they may ask you this as an MCQ question. This is a very good question for MCQ. You can build 3, 4. In fact, that is there. One question we have solved in our regular notes. It was an MTP question or previous MTP question. It was there in our class notes. Now we're going to solve study material question because it will help the non-regular students of us, so that at least they'll find the question. But I'll tell you why without formula I prefer. Maybe first we will take up the question. That will give you a little better context. Question number 20. Study material question. It is there. Maybe it is there as a TYK, test your knowledge question, I think. I don't know where it is there, but it is there in study material. That much I know. Okay, now, okay, check here everybody. A and R Limited is a large multinational company. Okay, their problem. How much is the face value? 100. The company, read this line carefully. Company is expected to grow at what rate? 15% per annum only for the 4 years. Infinite period only for 4 years. First 4 years or next 4 years it will grow at 15%. After that it will grow at 5% for indefinite period. For first 4 years growth rate is 15. Thereafterwards infinite growth 5%. Okay. Shareholders expect how much return on their investment? 20%. So for a shareholder it is a company. For a company it is for a shareholder it is a return. For a shareholder it is a return. Now if you give money to Infosys, if you as an investor buy Infosys ka shares, for you it's a return. For a company it will be a cost. Yes, no, one person ka return is another person ka cost. Just like debtor-creditor relationship in accounts, a return for one person will become cost for another person. So how much return equity shareholders are expecting? 20%. That only we call it as cost of equity. No, return expected by equity shareholders only we call it as cost of equity. Given as how much? 20%. Company paid expected. Company paid 120 as dividend for 2021 year. So this is already paid. Already paid means D1 or D0? D0. Shares of the company are traded at an average price of 3122 on the last day. If you check the market price of the shares in the stock exchange, what is the price? 3122. You need to find out intrinsic value of the share and tell whether the share is overpriced or underpriced. We'll talk about this later. We need to find out intrinsic value of the share. Brospati, don't write 3122. Sir, already given, sir. This is the market value of the share. Okay. We need to find intrinsic value means book value per share. These two value will not be same. Okay, we need to compare and then say share is overpriced or underpriced. So this we need to find. Sometimes they will say intrinsic value or sometimes they will say find out value as per dividend discount model. One and the same. Pretty easy question. Now people, if you are a shareholder, at best you will get two things. If you are an equity shareholder, you will get two things from the company. Can you tell me what is that? Dividend. And when you sell the shares eventually, you will get the money. Correct? All this you will get immediately or in future. Find out the present value of that. That is only intrinsic value. Because dividend you will not get now. You will get over many years. If you are planning to hold the shares for 10 years, means you will get the dividend for 10 years. That is a present value or future value? Future value. Find out first, find present value of dividend. First find what? Present value of dividend. Later you will sell the shares. When are you planning to sell the shares? 10th year, right? No? So that means you want 10th year ka value or today's value? They are asking intrinsic value after 10 years or now? Now that means find out the present value of the price of the share. These two if you add automatically, it is nothing but what? Intrinsic value. That is what that formula is telling. To calculate present value, we need formula, na people. We already know the table. Tell me what is the table? Year, cash flow, discount factor, congratulations, 20%. Present value of cash flows. Okay. First, we have to find present value of dividend. We have to find present value of dividend. How much dividend already paid? 120. Now, here they have given two growth rates. For the first 4 years, how much? 15%. Thereafter, it will grow at 5%. This 5% will grow for how many years? Indefinite period. So how much you will take? Don't know. This 5% can we take? No, this is for infinite period. So we don't know, right? But the dividend will grow at a constant rate up till which year? Fourth year. That means we have to stop our calculations at fourth year, because there afterwards it is infinite. Okay, na sir. Hence we will stop at which year? Fourth year. Why fourth year? Dividend is 15% is constant only up till fourth year. Okay. So find out the dividend for 4 years. They have given D naught. They have given D naught. What will we find? D1, D2, D3, D4. All these are present value or future value. Multiply this by what? Discount factor. What are we going to get? Present value of dividend. Agreed? Now, how much dividend already paid? 120. This is D naught, and dividend will grow for 4 years at what rate? 15%. So what will be D1? 120 plus 15%, 138. This is your after 1 year dividend. For year 2, what will be the dividend? Take 138, again add 15%. 158.7. Third year ka dividend will be this number plus 15%. Fourth year, this number plus 15%. This is your next 4 years ka dividend. Agreed? Present value or future value? These number, present value or future value? Future value. But are we finding intrinsic value in future or now? That means we need future value or present value. How do you, from future value, how do you get present value? Multiply discount factor. How much is the shareholders expecting? 20%. Right now that is your discount factor, because discount factor is after tax cost of capital. In PV also we have done. Discount factor is nothing but after tax cost of capital. Here, how many sources of capital we have? Only one, which is what? Cost of equity. Hence, cost of equity only will become discount factor, which is given as how much? 20%. Sir, all years ka discount same or different? If it is different, can we use PVAF or PVIF only? PVIF. At 20%, give me discount factor for each year. 1 divided by 1.2. I've taken 2 decimals, 0.83. Again, press go on, pressing equals to button, you will get the discount factor. Multiply these two. This is your future value, this is your discount factor. Multiply to get the what? Present value. Okay, na sirji. What is the total present value of dividend? Everyone got it? Pakka got it? Yes. This is what is first line of the formula trying to calculate. This portion of the formula, what we just did now, no? This is first part of the formula. If you want check, D1 divided by 1 plus cost of equity. 1. Cost of equity here is nothing but I. What is discount factor? 1 divided by 1 plus I whole power N. I, they have substituted with cost of equity. For first year, what is N? 1. For first year, what is N? 1. For second year, what is N? 2. Third year, what is N? 3. Or fourth year. That means basically they have taken dividend. There's nothing but this formula, if you have to rephrase, it is nothing but D1 into 1 divided by 1 plus cost of equity whole power 1. So what is this? Discount factor. They have taken first year ka dividend, expected dividend, and multiplied first year ka discount factor. Here what have they done? Taken second year ka dividend and multiplied second year ka discount factor. Third year dividend and third year ka discount factor. Fourth year dividend, fourth year ka discount factor. We need this, or we know this. We know this. That means adding all this, what are you going to get? So basically, you'll get the present value of expected dividend. So now really tell me formula is required. Now without formula, aram se we can solve. Yes or no, sir? Correct. Now if need a minute or okay till here. Now if you are a shareholder, you will only get dividend, or also you will get money when selling. Money while selling. Here dividend after 5th year, it will grow at infinite period. Now we don't know what is that infinite period is. So we'll have to stop all the calculation which year? 4th year. So I'll have to find price of the share for which year? 4th year. Correct. Now this also you know. People, how do you get P naught as per Gordon sir's ka growth model? Tell me. Here there is growth rate, no? Which is the only formula which uses growth rate? Gordon Chicha. Tell me P naught ka Gordon sir's ka formula, which uses growth rate. D1 divided by KE minus G. Yes, Ajay. Paka? Now, check ko. If you want P naught, you will take D1 divided by KE minus G. KE will remain constant. Growth rate is also constant. Similar way, if you want to find P1, what will be the formula? For P0, this is D1 means for P1 it will be D2 divided by cost of equity. If you want to find P2 means D3 by cost of equity. We want P3 or P4. For P4, what will be the formula? D5 divided by cost of equity minus growth rate. Yes, sir. Correct. First find that. And now we have D5 or we have only up to D4? We have D4. So what will be D5? No, don't add 15%. Prabhu. From 5th year onwards, growth rate is not 15%. From 5th year onwards, growth rate is not 15%. Macha, it is 5%. It is 5%. They told from 5th year onwards, it will grow by 5%. So what is D5? Take 4th year cut dividend and add 15% or 5%. You will get 220.29. Done, Aji. Cost of equity already given. How much is cost of equity? 20%. Growth rate now don't take 15%. It is 5%. Substitute, you will get P4. How much is that? Satisfied? Taka, you're doing your calculator. You're getting the same number. So you got the price of expected price of the share. How much? 1468.60. Okay, na sir. This is the price of the share now or after 4 years? After 4 years. Are you finding intrinsic value after 4 years or now? I mean, this is what value? Future value. As a shareholder, you will also get, when selling the shares, you will get this. But this is future value. But we need the value now. So what do we need? Present value. This is the future value. How do we find from the future value present value? Take this number and multiply discount factor. 1 second. 5th year ka discount factor or 4th year ka? Sir, this is 4th year ka price. So you will multiply 4th year ka discount factor. 4th year ka discount factor you already know. 0.48. Multiply. 704.9. What is this? Present value of expected price. As a shareholder, you can only get two things. Dividend and price. What is the present value of expected dividend? 428.76. What is the present value of expected price? 704. Add it, you will get intrinsic value of the share. That's all. Tell me, one formula also did we use? No. It is simply future value and present value calculation. That's all this formula also trying to calculate. Done now. Everybody got it. Pakkana ji. What is the intrinsic value you got, sir? 1133.68. Yes, sir. But currently the shares are trading in the stock market at what price? 3122. Stock market price is 3122. But as per us, the value should only be 1133, but it is 3122. That means share is underpriced or overpriced. So this share is overvalued by these two difference. How much is it overvalued by? 1988.32. Clear? Now look at the formula if you want. I think you already know first part of the formula. What is this, people? This portion is what? This portion is what? What is this trying to calculate? This is the present value of the dividend. Because there is nothing but dividend multiplied by discount factor. Dividend multiplied by the discount factor. How many years ka? 4 years. Okay. And then, okay, that's first part. That's what our first table did. Next, what did we calculate? Price of the share. Which year? 4th year. Why 4th year? Because after 4th year, growth was definite or infinite? Infinite. So we stopped our calculation at 4th year. How do you find 4th year ka price? If you're confused, go for Gordon Chicha. P0 is equal to D1 divided by K minus G. Similarly, P4 is equal to D5 divided by K minus G. By doing this, what are you going to get? P4. P4 means price now or after 4 years. I mean, what is this? Future value. But we need future value or present value. And so you have to multiply by what? Discount factor. Which year ka discount factor? 4th year. How do you get discount factor for 4th year? 1 divided by 1 plus I whole power n. N is 4. Instead of I, they are substituted with cost of equity. Because anyway, discount factor is cost of equity here. So that's what they asked. Done now. Okay, now I'll just show you the chart book. Why I prefer solving without formula is, I think I have written that somewhere. Why to write once again? Here. This is the formula. This part of the formula captures what people? Present value of expected dividend. This part of the formula captures what? By doing this, what are we going to get? Price of the share at the end of 4th year. What is this? discount factor for year 4. Okay, that means by adding all, basically by multiplying these two, what are you going to get? You'll get the present value of the share at the end of, you'll get the present value of the share. By adding these two, totally you're going to get the intrinsic value of the share, correct? Why do I prefer solving in the normal table fashion without formulas? In one's RTP, I think, or MTP, I don't know, right? What they asked us, they gave the same question, not as a descriptive question, but they gave the same question and they asked the question in MCQ format. You know what and all they asked? What is the present value of expected dividend? What is the present value of expected dividend? Now tell me, if you use formula, what is present value of expected dividend? If you do normal way, our first table ka total is nothing but present value of expected dividend. Straight away tick. But in formula, if you use, you can use, but you should know the meaning of formula. This portion of the formula captures present value of expected dividend. So that is 2-mark question. Then they asked price of the share by the end of 4th year. What is the price of share at the end of 4th year? Which portion of formula captures that? This. They asked this for 2 marks. Then they said, what is the present value of market price? How do you get present value of market price? By multiplying these two. That is one requirement. Then they asked finally, what is the intrinsic value of the share? That will be the total number. So using the same formula, they asked 4 questions. But when we solve individually, we know the answer for each component because that's the way we are solving. But in formula, you will get the answer as 1. So that's the reason I don't prefer to solve using this method. I prefer to solve using the normal way without formula. Govinda, got it. Huh. Okay. I thought one of us will break. Looks like I only have to break. Okay. Fine, people. I think we have done all the questions that I had in mind for this particular topic. Thank you for your time and patience. Hello, people. Let's continue our revision series. Now we'll be revising ratio analysis topic. Okay. Now in the chart book, I've only called out those ratios which are often tested in the examination. But let's do a thing. In ICI book itself, there is a summary of ratios. First, maybe we'll run through all the ratios once and then take up a few questions. Now again, from ratio is a good topic for examination. You'll not be asked ratio in a straightforward way. Like they will not say calculate current ratio usually in a straightforward way. They will again, like leverages, ratio will be find the missing figures wala question. Or they will give you some data, some ratio ka data using which we need to prepare P&L and balance sheet. That's examiner's ka favorite way of asking the questions relating to ratio topic. So again, easy, but it can go a little lengthy. And time. Again, the crux is here is the time. Able to identify what to start with. I'll take up a few questions there. I'll tell you certain things and points to keep in mind when you are solving the ratio questions. But before we get to that, first we'll have a quick run through of all the ratios. First, ratios are put into few categories. First is liquidity ratio. Under that, current ratio. Sir, how do you get current ratio? Current assets divided by current liability. Ideal current ratio is 2. Meaning if you have 1 rupee current liability, you should have 2 rupees worth of current assets. Similarly, quick ratio. Quick ratio ka another name liquid ratio, another name acid test ratio. How do you get quick ratio? Instead of current assets, you will take quick assets divided by current liability. And how do you get this quick asset? From current assets, reduce prepaid expense and reduce your closing stock. Because inventory and all you cannot sell quickly. It takes some time. Prepaid expense is really not an asset which you can sell. Hence, from current asset, remove these 2 parts. You will get the quick assets divided by current liability. See here, we are trying to test whether we have enough quick assets to settle the current liability. Ideal quick ratio is 1. Okay. Cash ratio. Cash ratio is given by the formula cash in hand plus cash at bank plus marketable securities divided by current liability. This ratio is trying to test whether we have enough cash balance using which we can settle current liability. Cash in hand, cash at bank is okay, no? Marketable securities means short-term investments. Okay, so whether these we have enough number or enough value to from which we can pay off current liabilities. That's what cash ratio is trying to test. Next, short-term investment. Less than 1 year. They will call it out clearly as marketable securities. You can directly take it. So you don't have to worry about the period. But short-term investments are those which are usually less than 1 year. Okay. Basic defense interval ratio. What is basic defense interval ratio is trying to calculate is if the sales of the company shuts down. If the sales of the company shuts down, for how long can the company survive? How long can the company survive? Like here, if you want to just check, let's say company incurs 365 lakh rupees expense per annum to operate for the whole year, to run the business for whole year. How much it will cost? 365 lakh. So this is for whole year. For 1 day, how much is the expenditure? 365 lakh is the expenditure for 365 days. For 1 day, 1 lakh. Okay. Now people, basic defense interval ratio is given by the formula cash in hand plus cash at bank plus marketable security plus amount collected from debtor. 4 things. Cash in hand, cash at bank, short-term investments or marketable security plus your debtor balance. Let's say that put together comes to 25 lakh. It comes to how much? 25 lakh. Now you tell me, to operate the business for 1 day, how much money you need? 1 lakh. How much money you have? 25 lakh. How many days can you run? 25 days. That's all is your basic defense interval ratio. So what's the formula then? Cash in hand, cash at bank, marketable security plus debtors divided by operating expense per day. How did you get this 25 days? 25 lakh divided by 1 lakh. No. What is this 1 lakh? Operating expense per day. If you take total operating expense and divide by the number of days, what are you going to get? Operating expense per day. That's all is a formula for basic defense interval ratio. Okay. I'll tell you the ones which are popularly tested when we solve few questions. I'm planning to do like 4 to 5 questions from this chapter. That way you'll get to know which ratios are often tested. But for now, ignore that and let's have a run through of all the ratios. Net working capital, how do you get? Current asset minus current liability. This is the liquidity ratio. Next is capital structure ratio. First one is equity ratio. This ratio is trying to calculate of your total capital employed, how much money has come through equity. Of the total capital employed, how much money has come through equity. Tell the formula. Equity divided by capital employed. You can call it as equity or you can call it as shareholders equity. Another name, net worth. All are one and the same. Basically, how do you calculate this shareholders equity? Equity share capital plus reserves and surplus. Divided by what? Total capital employed. How do you get total capital employed? Equity share capital plus reserves and surplus plus preference share capital plus long-term debt. All the long-term source of finance ka addition. That is your capital employed. Or instead of capital employed, you can also call it as net assets. Another name, one and the same. Now, same lines by debt ratio. What do you think is debt ratio trying to calculate? Of your total capital employed, how much money has come through debt? So, formula will be debt divided by capital employed. Debt for this purpose, they say, is both long-term and short-term. In my opinion, they should take only long-term because capital employed means short-term source of finance or long-term? Long-term. Since denominator is long-term, numerator also should be long-term. That's my view, but we can't go against ICI. ICI is Zindabad. So they are taking long-term plus short-term. We'll go ahead with that. Next is debt to equity ratio. So debt to equity ratio, how do you calculate? Debt divided by equity. Debt divided by equity. Okay. Again, the formula will say total debt too, but when they apply this in the question, they only take the long-term debt that we have seen in the few RTPs, MTP question. But the formula will say total debt divided by total equity. But we usually take only long-term debt in the numerator divided by equity in the denominator for problem solving purpose. Okay, next is debt to total asset ratio. Now, sir, if you want to buy assets, we need funds. Correct? The funds can come through equity shares or through preference shares or through debt. Debt to asset ratio is trying to calculate of the total assets, how much asset got funded through debts. How much asset got purchased with the help of debt. So in the name only there is formula. Tell me, debt to total asset ratio is given by the formula. Total debt divided by total assets. Why we calculate this is, sir, taking debt is a risky, no? Taking debt is a risky. Why? If you don't have money to pay, then what will the debt people do? Come to the organization and sell off your assets. So if lot of assets are funded by debt means, and if you're not able to pay this debts off, what will happen to these assets? It will stay in your business or debt holders will start selling it. So that's the reason we will also watch out for this ratio as well. Next is capital gearing ratio. Of late, a lot of questions in RTP, MTP are being tested on capital gearing ratio. So in that sense, this could be a little important. Even in this RTP, you will see RTP or MTP, capital gearing ratio is asked. Sir, gear, when you put a gear in car or bike, what will happen? When you put more, you obviously ride bike, you ride car, one of the things you ride, when you put higher gear, you will go slow na faster. Higher gear will imply higher pace or faster. Yes, no. Same goes for capital gearing ratio. Capital gearing ratio means using fixed cost instrument. What? Using fixed cost instrument to increase shareholders equity. To increase shareholders equity. You use fixed cost instrument to increase shareholders equity. First, the formula. You are using what for capital gearing ratio? Fixed cost instrument. Which source of finance on which source of finance you pay fixed cost? Debt and preference shares. Because preference dividend is fixed. Interest rate is also fixed. So what's your numerator? Preference share capital and long-term debt. And debt basically. Yes, sir. Divided by, why are you doing this? To increase shareholders equity. What is the formula for shareholders equity? Equity divided by reserve. Equity share capital plus reserves and surplus. Or you can call it as also net worth. Correct? If P&L balance is surplus, you will add. If P&L balance is loss means you will minus. That's common sense, no? So this is how you get the capital gearing ratio. Yes, sir, people. Fixed cost instrument in the numerator, equity in the denominator. Okay, what is a fixed cost instrument again? Preference share capital and your long-term debt divided by net worth or shareholders equity given by equity share capital plus reserves and surplus. So what is the meaning of capital gearing ratio? Using fixed cost instrument to increase the shareholders return. How is that? Just check here if you want to. Anyway, it told. Let's say first year sales was 10 lakh. Company is using debt on which how much interest is being paid? 1 lakh. Now, will this interest change every year or same every year? Same. First year, how much interest? 1 lakh. Let's assume this is the only income, this is the only expense. So, how much is your PAT, PBT, PAT or EISH? How much? I'm assuming tax rate is 0 for simplicity purpose. So, how much is your profit before tax? 9 lakh. Tax is 0. So, profit after tax also 9 lakh. Let's say preference shares is not there. So, EISH also is 9 lakh for simplicity. Okay, Naji? Next year, people, we saw bumper sale. From 10 lakh, sales became how much? 60 lakh. Will interest also, will there be a bumper jump or same amount? Interest rate is fixed. So that means how much is interest for second year? 1 lakh. Now what is EISH? 59 lakh. Why? Because from 9 lakh, EISH became 59 lakh. There is a big jump. Why? What is the main reason for that? Interest. Sales jumped. EISH also jumped. Fixed cost jumped as same. That means when you use this fixed cost instrument, shareholders' return will be same. It will increase. That is what is capital gearing ratio. Using fixed cost instrument to increase the shareholders' return. Because fixed cost will not change. Fixed cost will be same. In which source of finance you will pay fixed cost? Only on two sources of finance, which is debt to and preference share capital. So if you use that, means there is a good chance that shareholders' equity will increase. That's all capital gearing ratio is trying to calculate. You don't need to know the meaning. You just need to know how to calculate. For example, next to proprietary ratio. Proprietary ratio means how much proprietary funds has been used to buy total assets. How much proprietary funds is used to buy total assets. So proprietary means what? Owner. Who are the owners of the business? Shareholder. Do we have only equity shareholder or also preference shareholder? And tell me, how do you calculate proprietary funds then? Equity share capital plus reserves and surplus plus preference share capital. If you do this, you will get proprietary funds. What is proprietary ratio trying to calculate? How much proprietary fund is used to buy total assets? That means how do you calculate proprietary ratio? Proprietary funds divided by total assets. Same like debt to total asset ratio. Proprietary ratio is given by proprietary funds divided by total assets. And proprietary fund is nothing but owner's funds. Equity shareholders funds plus preference shareholders funds. On this, I'll tell you this. There is one more equation to calculate this that I'll tell you in problem. For now, leave this out. Don't worry about this. And this is also fine. No? Interest coverage ratio. Interest coverage ratio, how do you get? EBIT divided by interest. EBIT divided by interest. Now, people, what earnings is available from which we can pay interest? EBIT का full form is what? Earnings before interest and tax. From EBIT only you will pay interest. Yes. Hence interest coverage ratio is given by the formula EBIT divided by interest. Let's say EBIT is 10 lakh. Interest is 1 lakh. So when you calculated, how much you got? 10 or 10 times. This is a happy news or a sad news? Happy news or sad news? Happy news. Why? People, you have to pay how much interest? But how much profit is available? That means you can pay the interest once or 10 times. That means bank people are full jolly. Because they have given you a loan. Company has 10 lakh profit, but interest collectible is only 1 lakh. That means banker will be buku buku or happy. Happy because they expect this coverage ratio to be on the lower side or higher side. Better these coverage ratio, higher these coverage ratio, bank people and all will be comfortable. They will be comfortable giving you more and more loan to you. Similarly, preference dividend coverage ratio, you tell me. Is EBIT available for preference shareholders? For using what will you pay preference dividend? PAT, EAT, right? So that means instead of EBIT, you will substitute with earnings after tax or profit after tax divided by interest or preference dividend. PAT divided by preference dividend will give you preference dividend coverage ratio. Same way, tell me equity dividend coverage ratio. Is PAT available for equity shareholders or what is available? Each. So that means the numerator will be each divided by equity dividend. Each ka another name is net income. That's your equity dividend coverage ratio. Okay, next. This is fine. No? Next is efficiency ratio. I'll tell you one trick. These are all turnover ratio. First, let's read this. Total asset turnover ratio. Sir, when you look at the name, what is the formula that's coming into your mind? Total asset turnover ratio means what? Total asset turnover. No, by looking at the formula, what turnover means sales. It's saying total asset turnover ratio. By looking at the name, what formula is coming to your mind? Asset divided by sales. Asset divided by sales. Do the ulta. Whenever you see turnover ratio, any turnover ratio, whenever you see turnover ratio, what will come in the numerator? Sales. Okay, I'll explain the logic of this. So, you want me to tell it once again, or this is okay for you for exam? This is enough. Anyway, we don't need the logic for exam any which way, right? So, one simple trick of turnover ratio is what? Sales in the numerator, other component in the denominator. So, asset turnover ratio ka formula will be sales divided by total assets. Now, people, first priority in the numerator is always sales. First priority in the numerator is always sales. If sales is missing, then as a next priority, you will use COGS. If they give you both information, sales and COGS, first priority you will use what? Sales. Only if sales is missing, then you will go for COGS. Similarly, in denominator, first priority is average. First priority is average. Because sales, you will achieve it for 1 month or whole year. Whole year. Hence, we need the whole year ka asset balance on an average. But to calculate average, we need opening balance as well as closing balance. If they don't give, then you will take the total assets. First preference, average in the denominator. If that is not available or calculatable, then we'll go for closing balance or total assets. Okay. Now, okay, well, I'll just tell you the meaning of this. Suppose you got asset turnover ratio as 10. What does it mean? You got asset turnover ratio as 10. What is the meaning of this? If you get it as 10, anybody can tell me what is the meaning of this? Perfect. If asset turnover ratio is 10 means what is the meaning is, if you buy asset worth 1 rupee, if you buy asset worth 1 rupee, from that asset, how much revenue you will get? 10 rupees. From 1 rupee investment in asset, you are able to generate 10 rupees worth of revenue. That means you expect this number to be on the lower side or higher side? Higher side. The more higher these number, you are using the assets more efficiently. Hence, we are calling all this as what ratios? Efficiency ratios. Same way, build fixed asset turnover ratio for me. What's the formula? Sales divided by fixed asset. Numerator ka first priority, sales. Sales missing, COGS. Denominator ka first priority, average fixed asset. If that is missing, take the total fixed asset or fixed asset ka closing balance. Okay, Naji? Same way, fixed asset turnover ratio is 5. What does it mean? If you invest 1 rupee to buy a fixed asset, from that fixed asset, how much revenue you will get? 5 rupees. Higher these number, better you are using your, or more efficiently we are using our fixed assets. That's the meaning. Same way, capital turnover ratio. Chapandi. Sales divided by capital. You can call it as capital employed or you can also call it as net assets. Name is same. Okay, now if sales is not there, next priority, COGS. Working capital turnover ratio, same formula. Sales divided by working capital. Now, inventory turnover ratio. Inventory turnover ratio. So, what did we say? Sales divided by inventory. But hang on, you already studied. Inventory will, sales means it will include profit. Sales means it will include profit. Inventory you value it at selling price or cost price? Cost price. That means first priority for inventory turnover ratio should be sales or COGS. Here the ulta. First priority for inventory turnover ratio is COGS. COGS is missing, then you will go for sales. Clear? Because inventory is not valued at sales, it is valued at COGS. Goinda, got it. Denominator first priority, average stock. If that is not, if you cannot calculate that, then you will use closing stock. If inventory turnover ratio, if you get it as 15, what does it mean? You are able to sell your inventory 15 times a year. You are able to sell your inventory 15 times a year. Company wants to sell the inventories less times or more times. More and more we sell, more and more we will make money. So again, all this turnover ratio, we expect it to be on the higher side. Okay, debtor turnover ratio, same way construct. What is debtor turnover ratio? Sales. Sir, sales means total sales. Debtor comes from total sales or credit sales? Means a better number is what, sir? Credit sales divided by average debtors in the denominator. If average is missing, you will use closing balance of debtors. Correct, Aji? Everybody good? Okay, and do keep in mind this one. Once, I think, one or two questions we have on this. Sir, it is actually, this denominator is what? Read this line once again for me. What is it? Average accounts receivable. Accounts receivable andre debtors ledu. It's not debtors. Accounts receivable means debtors and bill receivable put together. Debtor and bill receivable both if you add, that we call it as what? Average accounts receivable. But in majority of the problem, bill receivable will not be there. Hence, we say accounts receivable and debtors are one and the same. But we have few questions in study material where bill receivable is given. Bill receivable is given. When bill receivable is given, accounts receivable is what, people? Accounts receivable is debtor plus bill receivable put together. Keep that in mind. Okay? Alright. Similarly, debtors velocity or collection period. Debtors velocity or debtors collection period. That is simply given by the formula 12 divided by DTR. 12 divided by DTR. This is 12 months. If you want collection period in months, you will use what in numerator? 12. If you want collection period in days, you will use what in numerator? 365. If you want it in weeks, 52. So basically, we have used this in working capital management and many other questions as well. Okay. We had explained the logic also of this to you. Or maybe once again, if you want, I'll tell you here. Let's say DTR is 4. DTR is, what is DTR? Debtors turnover ratio. Debtor turnover ratio is 4. What does DTR 4 mean? Debtor turnover ratio 4 means, what does it mean? So from debtors, we collect the money. If debtor turnover ratio is 4 means, the meaning is company is able to collect from the debtor how many times a year? 4 times a year. 4 times a year. That means how much credit are we giving to the debtor? In a year, how many months are there? 12 months. 4 times if you are collecting from the debtor means roughly you are giving 3 months credit, no? Because 3 into 4 is how much? 12. And in a year, how many months are there? 12 months. Okay, so from the debtor turnover ratio, can't we find out debtor collection period? Yeah, if debtor turnover ratio is 4 means, looks like on an average collection period is 3 months. Now that you can calculate in one formula called debtors velocity or debtors collection period is given by the formula 12 divided by DTR you do. Here, how much is DTR? 4. 12 divided by 4 is how much? 3 months. Same thing you will get. Fine now, people. So this we will use for examination. Correct. Same way, tell me payable turnover ratio. Now don't say sales. Sir, it's payable. Creditor and sales, any link or no link? No link. Sir, when you do ratio, right, you take one number in the numerator, another in the denominator. You can't take random numbers. There should be some connection. Numerator and denominator should be connected, not random variable. Is creditors and sales connected? Is creditor and sales connected? From creditor, you sell the goods or purchase the goods? So numerator should be sales or purchases. Total purchase or credit purchase. So that means payable turnover ratio is given by the formula annual credit purchase divided by average accounts payable. If that is not available means closing balance of accounts payable. And accounts payable means what? Creditor and bills payable put together. If bills payable is not there, and accounts payable and creditor will be same. Similarly, can you also calculate payable velocity or payable payment period? Same. What is that? 12 divided by PTR. PTR andra payable turnover ratio. So 12 divided by payable turnover ratio, if you do, you will get payable velocity or payable collection or credit period. Till you are comfortable. This and all you know. GP ratio is GP by sales into 100. Net profit ratio is net profit by sales into 100. Operating profit ratio is operating profit divided by sales into 100. Operating profit only we call it as EBIT. Okay, now some expense ratio. COGS ratio is given by the formula COGS by sales into 100. Operating expense ratio. Operating expense means selling and distribution overhead and administrative overheads put together. So that is your numerator. What is in the denominator? Sales into 100. This is important. Operating ratio, how do you get? It's not operating expense ratio. It is operating ratio. Sir, to run a business, you have to incur overheads also. You have to incur COGS also. You'll have to incur some direct expenditure also. You have to incur some indirect expense also. So operating ratio means COGS plus operating expense divided by sales into 100. Operating ratio is COGS plus operating expense divided by sales into 100. One, there is a small takeaway from this problem. If time permits, I'll take up the question. Otherwise, I'll tell you here only. In one of the problems, RTP or previous year or whatever, we had seen operating ratio was given as 85%. How much? 85%. Once again, operating ratio means COGS is also included. Operating expense is also included. Yes, sir. Once again, or okay? COGS and operating put together. COGS plus operating expense put together is how much percentage of sales? 85%. Correct? No. So that means indirectly, if they give you operating ratio as 85% means balance 15% is there. No, that is nothing but EBIT. That is nothing but EBIT. Sir, from sales if you reduce COGS, what are you going to get? GP. From GP if you reduce operating expense, you're going to get EBIT. These two put together becomes your operating ratio. These two put together becomes operating ratio. If this is 85% of sales means EBIT obviously will be 15% of sales. Yes, sir. So this is another equation which you may have to use. If they give operating ratio as 85%, then EBIT will be 15% of sales. Using this, either you can find EBIT or you can find sales as a balancing figure. If time permits, I'll take one question on this. It is there. Okay, sir. Now let's see if operating ratio is given as 70%, then if operating ratio is given as 70%, then what will be EBIT? Balance is what? 30%. If operating ratio is 60%, EBIT will be 40%. Like that, use the balancing figure and get it. One of the things using this you can find as a balancing figure depending on the requirement of the question. Can I move on? COGS plus
operating expense
will
be
COS. Yeah, you can substitute. Financial expense ratio. How do you get? Financial expense means your interest. So interest you are expressing on sales. So given by interest divided by sales into 100. Now some profitability ratios are return. Now people, return on investment you can calculate on three things. Return on investment. One you already know. ROS. ROS as in return on capital employed. Or it could be ROE. Return on equity. Or it could be ROA. Return on assets. ROA. Okay. ROS ka formula, tell me people. EBIT divided by capital employed into 100. Return on equity ka? Is EBIT available for equity shareholders or what is available? Each. Divided by capital employed or equity? Equity. So that is your ROS and RO ka formula. Okay. Sometimes they will say calculate ROS on an after tax basis. Calculate ROS on a after tax basis. Sir, how do you get something on an after tax basis? Multiply 1 minus tax rate. Reconstruct that formula of ROS for me. EBIT into 1 minus tax rate divided by capital employed into 100. A return on equity is already on after tax basis because you are taking each. Each you will get only after tax. So this you don't have to do 1 minus tax rate. Okay, na? Everybody fine? Now, one more return is your return on assets. Now, return on assets, there are two ways to calculate it. Depending on the information that we need on the question, we can use both the formula. One, return on assets is given by the formula PAT. Here, somewhere it is there. Here, PAT divided by average total assets. PAT by total assets. That is one. Or you can use EBIT into 1 minus tax rate divided by average total assets. Okay, you check what you need in the problem. If you need to find EBIT in the problem, you will use this formula. If you want to find PAT in the problem, you will use the other formula. Both are acceptable. You check what you need and accordingly use whatever formula is better suited for that particular question. Okay, EPS you already know. How do you get EPS? Each divided by number of equity shares. Dividend per share. Dividend per share. How do you calculate this? Total dividend divided by number of equity shares. This is also fine. Dividend payout ratio. People, payout ratio is always expressed on EPS. Payout ratio always calculated on EPS. So, dividend payout ratio ka formula you tell me? DPS divided by EPS in, that's, if you want it in percentage, you multiply by 100. Price earning ratio again you know. MPS divided by EPS. Dividend yield. Sir, one quick trick is when they give you yield. Yield means market price. In whichever formula in ratio they say yield means market price will come in the denominator. So dividend yield ka formula you construct. DPS by MPS. Earning yield. EPS divided by MPS. Basically MPS will come in the denominator. Okay. I'll not go into too much of logic of all this. Now we just revise. Okay. So that's enough. We have discussed much more in the normal class on this. Market value book value ratio. Name only there is formula. Market value per share divided by book value per share. Q ratio. Q ratio again this is not something which is asked too many times. Only once it was asked. So again this is something which just watch out. When something which is not asked, when it comes, it will come as a very straightforward question. They will not give too much of pandaginda and they'll ask for 2 marks, 3 marks. Because they know that majority of the students will be like, they will skip that. Okay, so just know it, it's easy only. Q ratio is nothing but total market value of equity and liability divided by replacement cost of asset. Now people, asset will never come forever. Will any asset in the business last forever or you have to replace it? To replace an asset, we need money. That money you will raise it either as a debt or as a equity. So that is what this ratio is trying to calculate. Whether we have enough money in our equity and liability to replace our assets. Hence, Q ratio is given by the formula market value of equity and liability divided by replacement cost of asset. Suppose to replace the asset, we need 10 lakh and our market value of equity and liability is also 10 lakh. So that means how much is Q ratio? 1. So what is in an analysis of this ratio is if Q ratio is exactly 1. If Q ratio is exactly 1, share is fairly priced. Share is fairly priced. If Q ratio is greater than 1, then shares are overvalued. If Q ratio is lesser than 1, shares are undervalued. Maybe they may ask you the analysis also. If you, it's there in ICA study book. If you want to write, you can write this down quickly there somewhere in a notebook. If you want to copy, it is there. It's there in the study material also. It's not there in the summary book. It's given in the normal section of things. But still, if you want to copy, yes, free to do so. Okay, na sir, move on. Q ratio is 1 means stock is fairly priced. Greater than 1, stock is overvalued. Lesser than 1, stock is undervalued. Okay, sir. Next, DuPont model. What? DuPont model. Normally we eat like this, no. DuPont model is like this. That's all. Finding the same way through a different route. That is DuPont model. Now people tell me what is ROSE. Full form, formula tell me. EBIT by capital employed. DuPont sir doesn't like that. Nah, no maza. Maja illa. As per DuPont model, you know how do you get rows? You take operating profit margin. You take what? Operating profit margin. Multiply capital turnover ratio. You take what? Operating profit margin and multiply capital turnover ratio. Check. How do you get operating profit? EBIT by sales. How do you get capital turnover? Sales by capital employed. This sales, that sales will cut to what remains? EBIT by capital employed. What is Rose ka normal formula? EBIT by capital employed. Sir doesn't like this. This way. Okay now. Sir, that means in exam we will cut this. No. In exam they will not give you this data. They will directly say operating profit and they will say capital turnover. So you should know that by multiplying these two you will get rows as per DuPont model. Fine, huh? So this is one. Next, DuPont model did not stop there. They said, why stop it at rows? I will also give you one more formula for row. Return on equity. For equity shareholder, operating profit is available or net profit is available. So instead of operating profit, substitute with net profit. Instead of capital turnover ratio, substitute with asset turnover ratio. And multiply by equity multiplier. Net profit margin, then asset turnover ratio multiplied by equity multiplier. These three, if you multiply, you will get the return on equity. By the way, by doing this also, you will get the same answer. Because net profit margin is, how do you calculate net profit margin? Net profit divided by sales. How do you get asset turnover ratio? Sales divided by total asset. This sales cut. What is the formula for return on equity? Tell me, what is the normal formula for return on equity? Each divided by equity. Correct, huh? So ultimately we should get this. Okay, so far what have you got? Net profit margin by sales divided by total assets. This cut. Right? But total asset is still there. Do we have total assets here? No, that means how do you get equity multiplier? Tell me. This total asset should be cut. It's there in the numerator. How to cut it? Bring in the numerator. So equity multiplier will be, how do you calculate? Total assets divided by what do you need in the denominator? Equity. Now tell this sale cut, this asset cut. What remains? Net profit by equity. Usually preference shares will not be there. When preference shares are not there, net profit or PAT only will become ish. So everything is same only. You will get the same thing, but in a different way. And in question, they will not give you all this data. They will give you what data? They will give you these three data. So, but by multiplying, you should be able to figure out that you will get ROE. Again, all this will be one marker, straightforward question. So just multiply and get the answer. Done, people. With this, all this ratio, meaning and its calculations, we are done. Tata bye bye. Or you want to do some problems? We'll do some problems. Pakka na. Ajjo. I thought you will say no. I actually made up my mind. I'll pack and leave. Caught hold of me. Fine. Ninth question. I have taken some questions which I feel covers some good area with respect to the ratio. Yeah, much. I'll also come, madam. He's going, it seems. We'll all go. He's like, yes, sir, we'll go, sir. Sir. What is there in the ratio, sir? Boring. Okay, question number. There's a question number 9 in our notebook. It's again a study material question. Let's see what we can learn from this question. Following financial ratios of PQR is available for year ended 31st March 21. Now, people, ratio question will be quite lengthy. They will give you balance sheet or they will give you a dump of data. Always, and this is not just for ratio topic, whenever the question is lengthy, first have a quick look at the requirement. What are they asking? You need to prepare summarized P&L and also balance sheet. So they have given certain ratio information using which you have to prepare P&L and balance sheet. Okay, sir. Now the best way according to me to solve ratio question is they ask P&L and balance sheet. One page P&L format. Another page balance sheet format. From third page onwards working out. Read the data. If it directly comes in P&L means push it to P&L. If it directly comes in balance sheet means push it. If it is not coming anywhere means let's keep it on hold and then figure it out. Okay, sir. That way you don't have to read the question again and again. Okay. That's one approach. Have the format. Another one you should keep in mind in ratio problem is, normally people when you read this data, see now you don't even feel like reading this data, correct? No. GP 15% of sales, net profit 8% of sales, this is some works cost to this, they've given. Okay, they've given a dump of data, but any number is there or everything is connection? One is connected to the other, but nothing has a value. So when they give you a question like this, check. There will be one component which will be linked multiple times, at least 2 or more times they will link it. That's your clue. Okay. Now here check, they have given value of the, first of all, there's a data for which year? Year ended 31st March 2021. Now they told fixed asset as on 31st March 2020. Current year, last year. How much? 26 lakh. Anywhere they have given depreciation data? Depreciation rate? No. That means what is the assumption? Last year if it was 26 lakh means current year also 26 lakh. No information to find, depreciation. 1. Or fixed asset could be land also. On land we don't depreciate. So we don't know. So lack of information. Last year 26 means current year also 26. So one value finally we know. How much is that? 26 lakh. First to push this to balance sheet. Over. Okay. As and when I see, maybe I'll tick off. And this is over. Next. Now people, if they've given one value, usually they will connect. Fixed asset, they will link it. Check, is fixed asset linked with anything? Here I don't see anything. I think I got the point. Fixed asset, they've linked with sales. Fixed asset, they've linked with current assets. And then they've given current ratio. How do you get current ratio? Current asset by current liability. So current asset has got linked with current liability. Current liability has got linked with long-term loan. That means I have figured all 3-4 components I figured out. First working note, what? To find sales. They told fixed asset divided by sale is 1:3. So use that as a first working note. Fixed asset by sale is 1:3. Fixed asset value they have given. So you can find sales as 78 lakh. Yes, sir. Immediately push sales to P&L. Sales in P&L mein sales will come for 78 lakh. Sorted out. Okay, next. What have they linked the next to? They linked the fixed asset with current assets. So fixed asset divided by current asset, if you do, that is in the ratio of 13:11. So next use this basis. Fixed asset by current asset, if you use fixed asset, you already know 26 lakh. Using this, you'll be able to find current assets. How much? 22 lakh. Any problem? Current asset, where it will come? P&L or balance sheet? Current asset, P&L or balance sheet? Balance sheet. Now one more point, this will apply in every problem. Whenever they ask balance sheet, in current assets, you'll have breakup. What are the components of current assets? Closing stock, debtor, cash, all this will be there. What is the total current assets you got? 22 lakh. Now what you do is, components like closing stock, debtors, you show it in the inner column. You show it in the inner column. Total, you show it in the outer column. Don't forget this. Why? I'll tell you in a bit. Now, did you get total current assets? How much? 22 lakh. Where will the total current assets come? Balance sheet. Inner column or outer column? Outer column. Done now. And that means people, the moment you see this, one thing should click. Fixed asset 26 lakh. Current asset 22 lakh. Fixed asset plus current asset is what? Total assets, how much? 48 lakh. Balance sheet always matches for us. Even when it didn't match also, it matches for us. Somehow we used to write something and match it. Yes or no? So this side 48 means equity liability side is also 48. Don't forget that. Okay, in balance sheet when you're doing, 2 components you should not forget to. One, showing it in the components in the inner column, total on the outer side. And the moment you get one side total, also update another side total. This will be your hidden adjustment for to find something there. Okay, now this is done. Next, anything else they have linked? Yeah, current ratio they told us 2:1. What is current ratio ka formula? Current asset divided by current liability. Current asset you already know. Current ratio also you know. With this we can find what? Current liability. How much is this? 11 lakh. You will show this in the outer column. So current liability how much? 11 lakh. In balance sheet, current liability 11 lakh. Easy. Okay. Next, anything else they have linked? Yeah, current liability, they have linked it with long-term loans. Long-term loan divided by current liability, if you do, you will get 2:1. So long-term loan divided by current liability, you do. you will get 2. So therefore, long-term loan will be 2 times of current liability. Current liability is 11 lakh. 11 lakh into 2 is how much? 22 lakhs. Long-term loan, where it will come? Long-term loan, where it will come? Balance sheet. Which side? Liability side. Long-term loan, 22 lakhs. Yes, sir ji. Paka. Sometimes they will say it is 10% long-term loan. It is 10%. 10% means interest. They also ask P&L. So don't forget to show interest in P&L. Here percentage given or missing? Missing. That means can we calculate interest or not possible? If it is, sir, in ratio problem, no, to the extent you solve. And don't put to follow schedule 3 format alone. Accounts. So here everywhere normal. This balance sheet format and normal P&L format. Schedule 3 format, venda, beda. Yes. What much? Okay, done. Now here, is this interest rate there or not there? Not there. So can we find out interest or not possible? Not possible. So that means this information from here to here, everything we have captured. Correct? Yes, people. We read the question. Anywhere we see preference share capital. Preference share capital anywhere we saw? No. Take a calculator. What is the total equity and liability side? 48. Now tell me, sir, or maybe tell me once again, what and all can come on the equity liability side? Equity share capital plus reserves in surplus plus long-term debt plus preference share capital plus current liability. Yes, sir. Current liability we have found. Preference share capital not given. So 0. Long-term loan we already found. Correct? No. That means you will be able to find these two. Sir, you can write equity share capital and reserves in surplus, or you can simply call it as net worth. Yes. How much is net worth balancing figure? Calculate for me. 48 lakh minus 11 lakh minus 22 lakh. How much? 15 lakh. Got it? That's the reason I said always have the total. Because one of the component you can get it as a balancing figure. Easy. Equity and reserves in surplus put together if you do, you should get 15 lakh. That only we call it as net worth. Correct? Yes, no, people? And that's what I've done here. Where is it? Total equity and liability side is 48 lakh. What and all can come in the equity liability side? Equity, long-term debt, current liability. I have not written preference share capital because it is not there. So therefore, what is equity or net worth like you told? 15 lakh. So far good. Now they have given one more information. Check in the question. What did they say? Capital to reserves and surplus is in the ratio of 1:4. Capital and reserves, both if you add only, you will get what? Net worth. Or you can call it as equity. Yes, no? Equity is in what ratio? 1:4. And equity ka value you just now got. How much? 15 lakh. Therefore, what is equity share capital, reserves and surplus? You just have to distribute in 1:4 ratio. 15 lakh you distribute in 1:4 ratio, people. Capital is 3 lakh, reserves and surplus is 12. Got it? Yes? Right. They're in the other mood only. Okay. Capital 3 lakh, reserves and surplus 12 lakh. So we have, in fact, balance sheet we have finished. Except to individual component of current assets we have found or not yet? Not yet. That we will figure out. But without that, total level we have completed. Okay, now let's see. From here to here, we have used all the information. Now they have given first information. Let's see if we can use that. How much is GP, people? 15% of sales. Sales you already know. Yeah, sales we have already found. Okay, first let's review this, or else maybe one second, hang on. Maybe we'll read all this data and then we will solve each component. Sir, sales you already know. Because fixed asset was linked with sales. Sales we have already found. From sales you can find what? GP. Have they given net profit? Net profit is 8% of sales. You can find net profit. Sir, works cost is nothing but your COGS. It's nothing but your COGS. Sir, from sales if you reduce GP, what are you going to get? From sales if you reduce GP, you're going to get cost of goods sold. If sales is 100, if GP is 15%, if GP is 15% of what? Sales. What is GP amount? 100 ka 15%. How much is that? 15. Therefore, what will be your COGS, people? 85. Correct? Or can I say COGS is 85% of sales? if GP is 15% of sales means COGS will be balance, which is 85% of sales. Got it? Huh? And do you know sales? Yeah, if you know sales, you can also find out COGS. COGS is nothing but your works cost. This works cost, they have linked it with 3 component check. Raw material consumed is 20% of COGS. Direct wages is again 10% of COGS. Stock of finished goods is 6% of COGS. That means many things are linked with COGS. Correct now, people? So we can finish off many things. Can we quickly do it? Okay. I'll these 2 information, I'll read it in a bit. Now first, what is that they told? GP. GP is how much percentage of sale? 15% of sales. How much is sales, people? 78 lakh. 78 lakh of 15% is how much? 11 lakh 70,000. How much is? So if GP is 15% of sales, I can't keep up with them. They're shouting more than me. Correct da? Correct da? Huh? Interesting. Okay. Sir, if GP is 15% of sales, COGS will be 85% of sales. So calculate COGS. And net profit is also given. How much is net profit? 8% of sales. So you found all this. GP will come in P&L account or trading account? GP da. GP da. Trading account. 11 lakh 70,000. Go ahead and put Chukki. 11 lakh 70,000. Net profit. How much is net profit? 6 lakh 24,000. Net profit, you put it in your P&L account. Okay, na ji? Then few things they linked again with works cost. What are those things they linked with works cost? What and all they linked? Once again, if you want, I'll show you. Raw material consumed is how much? 20% of works cost. Works cost is nothing but your COGS. So 20% of COGS is raw material consumed. 10% of COGS is wages. And 6% of COGS is stock of finished goods. These 3 they have linked. That's what we have found here. Raw material is 20% of works cost. Works cost is COGS. How much we got as COGS? 66 lakh 30,000. 66 lakh 30,000 ka 20% to 10% to 6% to these 3 numbers. Any problem? No. Tell me where all this information will go. Raw material consumed. Where it will go? P&L or trading? How do you get raw material consumed in equation? Can you tell me? How do you get raw material consumed? Opening stock of raw material plus purchase of raw material minus closing stock. Yes, sir. Means when you show raw material consumed directly, will these 3 components come in trading account or it will not come? Because considering this only, you will get raw material consumed. So again, you don't show opening stock of raw material and closing stock of raw material in trading account. So what does raw material consume? 1326. Push this. Raw material consumed 13,26,000. I have told how we have got that. Okay, next wages. How much, people? 6,63,000. Direct wages. So trading a P&L. Trading account. 6,63,000 direct wages in trading account. Then we got what? Stock of finished goods. Raw material. Stock of finished goods. What stock is this? When they say stock, it is closing stock. How much closing stock? 3,97,800. Closing stock will only come in trading account or also balance sheet? In balance sheet, where? Under current assets. Current asset total we have already captured. Under that first component we got, it is closing stock of finished goods. How much? 3,97,800. Raw material we have not yet identified. We'll come to that. Finished goods is 3,97,800. Okay, Naji. Only here or also trading account? In trading account, write closing stock of finished goods. WIP not given, just for reference I've written. Okay, then what else we found? This is also done. Then closing stock of raw material, they told something. Check what is that, people? Stock of raw material is 3 months of usage. Usage means raw material you will sell or consume. Usage here refers to consumption. 3 months of annual consumption, you will keep it as a raw material ka stock on an average. Once more, stock of raw material is how much? 3 months usage. Usage means COGS. How much ever you are consuming in a year, 3 months of that you will keep it on an average as closing stock. Now people tell me, how much raw material have you consumed whole year? Raw material consumed for the whole year is 13,26,000. This 13,26,000 is for 1 month This 13,26,000 is for 1 month or 12 months? 12 months, right? Oh, in 12 months stock you're keeping or only 3 months stock? This 13,26,000 represents 12 months. How much for 3 months? Calculate this for me. 3,31,500. What is that? Closing stock of raw material. Will this come in trading account or it will not? It will not come. Why? Because you have already shown a raw material consumed. How do you calculate raw material consumed? Opening stock of raw material, purchase of raw material minus closing stock of raw material. Again, if you show closing stock of raw material, it will be double consideration. So it will not come. In where? It will not come in trading account, but it will come in balance sheet. Closing stock also comes in balance sheet, no? So what is closing stock of raw material you got? 3,31,500. So that is your second current asset component, closing stock of raw material we got. So we are pushed. Yes, sir ji. Okay, next what information they gave? Debtors collection period is 60 days. Now it's very simple. Tell me how much is sales? Sales is how much? 78 lakh. Sir, this 78 lakh is the value for 1 day or whole year? Whole year. Some problems may they take 365 days or 360 days. Anywhere here they mentioned no. If they don't mention, then we'll take the normal. 1 year is how many days? Sir, this 78 lakh is a sales for 1 day or whole year? Whole year. Whole year means how many days? 365. 365 days credit are you giving to your debtor or only 60 days? For 60 days, how much is the value? For 365. Sir, debtors is linked to credit sale, no, sir. This 78 lakh is total sale, sir. This is wrong, sir. Yeah, correct. But have they told anywhere cash sale? If they don't give any cash sale information, assumption is what? Total sales, credit sale, both are same. Meaning all the sales are made on a credit basis. So for 365 days, value is 78 lakh, but collection period is only how much? For 60 days, how much value? Pro rate, X is equal to what here? 78 lakh into 60 divided by 365. How much, pa? That is nothing but your debtors. How much? 12 lakh 82,192. Fine now. Debtor will come in trading P&L or balance sheet. Any problem in this calculation, everybody, or okay? Or if you don't like this approach, I can show you another one. You want another one? This is easy. I would suggest this to do an exam. If you want, we can do another one. What is that? No, okay, sir. This only better, sir. How do you calculate debtor turnover ratio? Debtor turnover ratio. Debtor turnover ratio. Debtor's collection period. Sales or first 1 minute. Okay. I think what I have to do is, okay, I think if you want to use formula method, I have to find out one more. Wait. Now people, how much is, now do you know debtor collection period? Yeah. Using debtor collection period, you can find debtor turnover ratio. Yes, no? What is that? 1 divided by debtor's velocity you can do. Agreed, no? How did you find out debtor velocity? How did you find debtor's velocity? Or okay, we'll use that formula only. Wait, bad. You're looking at me differently. Okay. Now if you want to, yeah, what, they're not going only here. Sir, if you want to calculate debtor's velocity, what is the formula? 12 divided by debtor's turnover ratio. Yes, sir. Debtor's velocity means collection period. Here collection period is missing or given. How much? 60 days. Sir, it is in days means I have to use 12 in the numerator or 365. 365. 365 divided by DTR. Therefore, DTR will be what? 365 divided by 60. Correct now? That is what I told in the formula. Debtor's turnover ratio is 12 divided by DTR. We leave. Tell how much is this? 6.083. Okay, now. Then what is another formula to calculate debtor turnover ratio? Sale. Here anyway, sales and credit sales both are same. Divided by average accounts receivable. Average number is not there. So we will take accounts receivable. Here bill receivable there or not there? And bill receivable are not there. Debtor and account receivable will be same. How much is debtor turnover ratio? 6.083. What is sales? 78 lakh. Divided by debtors. Now to calculate how much is this? You'll get round off errors, obviously. That's acceptable. Same number. Now you tell me, you want to do whole this drama, na? All of this you want to solve. Oh, don't you think this is easy? It's easy. Okay. If you want to use actual ratio formula, this one. Lengthy. So it's pretty common sense also. Sales they have given. How much? 78 lakh. 78 lakh is a number for 1 day or 365 days. What is the collection period? For 60 days, what is the value? Unproportionate. So this is much easier. I would suggest this for examination. If you don't like it, you can use actual ratio formula and get it. There will be a slight round off error because this is not 6.083. We stopped at 3 decimal. There are more. So some round off error will come. Done, Sarji? Okay, this is also done. Next, what else remains? Anything else we have not used or everything we used? Everything we have used. Yes. Now, first balance sheet we'll figure out. Debtors we got 12 lakh. How much? 82, 192. Now, why did I ask you to have total current assets in the outer column and components in the inner column is add this for me. Whatever value so far you have got, add this for me. Only this. Add only this circle number. This number. 3,31,500 plus 3,97,800 plus 12,82,192. These three numbers. You're getting 20 lakh something, but total current asset is 20 lakh or 22 lakh. It is not matching. There is a balancing figure. Have they given any information or no info? Now you will never be able to tally balance sheet. If you write this in the outer column, you will keep saying 1 lakh balance sheet not matching. Sir, it is summarized balance sheet. So whatever is not matching, you will get it as a balancing figure. What is that? That is outer column, inner column will help you to figure out this. Okay, now, so what is that component? What is the difference? 1,88,500. So stock has come, debtor has come. What is one main component which has not come? Maybe prepaid expense, maybe cash. Prepaid expense mandatory. No. I think among prepaid expense, cash, which is a better one? Cash. Or if you don't want to give name, simply you can write other current assets arrived as a balancing figure. That way I would always suggest have the total in the outer column, components in the inner column. So you will be able to get one component as a balancing figure and balance sheet will match out. Okay, na sir. Balance sheet over. What about trading P&L? Not yet. Unfortunately, not yet. Now, sales, I think we have already ticked. Gone. Now, everything we have ticked. GP also we know. But is total matching or still there is balancing figure? Still there is balancing figure. Now, tell me what and all have you considered? Raw material consumed we considered. Direct wages we considered. So, the moment raw material is there, we are a trader or manufacturer. Manufacturer will only have material cost, labor cost or also production overheads. Means you will get manufacturing overhead as a balancing figure. These are summarized P&L. One or two components you will get it as a balancing figure. So, manufacturing overhead not given, you will get it as a balancing figure. Yes, sir, Sarji? Yes. First thing you will write in P&L is by GP brought down. And net profit also you know. Matching there is balancing figure. What will come in your P&L? Selling and administrative overhead. Administrative overhead, selling and distribution overhead. That only we call it as operating expense. Arrived as a balancing figure. That's all. This problem over. Done, Aji. It will be lengthy, but you need to identify what is tied out. That don't forget. So the takeaway of this question, if you have to summarize. 1. Current asset ka total you put it on the outer column of balance sheet. Same goes for current liability. Current liability, usually they will not give breakup. So it really doesn't matter. This outer column, inner column makes a lot of sense for current assets. That is one. Another one, the moment you get fixed asset total, current asset total, get the balance sheet asset side total. Same thing will become liability side ka total as well. Update the totals immediately. So if you're getting stuck, always think on the total. That could be one of the clue. Here, how did we get net worth? Would they give? No, we got net worth as a balancing figure by looking at the total. So hence have the total in mind. Okay. Then check one component will be linked multiple times. At least 2 times they will link. Start with that. So that way you will be able to proceed the question faster. Here what was linked? Fixed asset was linked. So we started with that and accordingly, yeah, we solved majority of the things. Done, people. And that's pretty much about this problem. Can we move on to the next question? One is only enough. Our mind want to say yes, so, but heart is saying few more. Yeah, no. Tummy is saying, bido, we'll go home. Yeah, let's go and have fun. Okay. Can we do 4 questions I had kept, one over. After this, I will ask. If you say stop means stop only. Continue means continue only. Whatever you say. Then continue, sir. Okay, sir. Fine. Ganapati Limited has the following ratio. Sir, these are all some class question. I had marked it as LDR. Okay, last day revision questions. So I have big list of LDR. So that's okay. Leave that. Let's not worry about that. Sales, how much? LDR means last day revision. Okay. Sales, how much? 60 lakh. Return on net worth. 1 second, people. Return on net worth ka formula, tell me. Return net worth means equity. That means return on net worth is nothing but return on equity. What is the formula for this? Each divided by equity is equal to 25%. Yes, sir. Maybe we can use this somewhere. Let's see. Income tax rate 50%. Fair enough. Share capital and reserves is in the ratio 7:3. Last problem 1:3, I think. Here it is 7:3. Current ratio they have given. Check this. Sales they have given. No? Now they told net profit to sale is 6.25. Net profit means always what, people? PAT. So that means basically if you do PAT divided by sales, you will get 6.25%. Sales you already know. This answer you already know. From this what we can find? PAT. Okay now. And preference shares is not there. That means PAT and each both will be same. That means we can use this equation to find net worth. From net worth, we can find share capital and reserves and surplus. Automatically linked. Understanding? Am I speaking to myself? Okay. Inventory turnover ratio based on COGS is 12. And COGS is also given in the question to be 18. That means easily you can find. Inventory turnover ratio ka formula. COGS divided by first priority average stock. If you cannot find average stock, closing stock. Okay, let's see if we can find or not, average stock or not. Interest on debentures, they have given how much? 60,000. This they have only given. Receivables, they have given. Payable, they have given. Awesome. You need to calculate operating expense. We need to calculate operating expense. Also, you need to prepare balance sheet in this format. They have only given. But good thing is, they have only filled out few components of balance sheet. What are those? Receivable, how much given? 2 lakhs. Now, we will not write in the outer column. We will have the inner column approach. Okay, next to payable is how much? 2 lakh. Okay, people, one more clue is 15% debentures. It is 15% debentures. You know the interest amount. You know the interest rate. Can't you find out debenture value? How do you find? Interest amount divided by interest rate. 60,000 divided by 15%. How much? 4 lakh. This also you got. Correct, Aji. Anything else they have given? No, this we have figured out. Next, I think normal. No. Once again, if you want, I'll tell you. They have given net profit to sales how much? 6.25. Is sales missing or given? So first working note is this. From this, what we can find out? Tell me. Net profit. Net profit ka another name. PAT. So check the working note number 1 what we have done. PAT. How much is net profit? 6.25% of sales. So therefore, net profit is 60 lakh ka 6.25%, which is 3 lakh 75,000. Sorted. Okay. Next, they gave return on equity. They have given return on net worth or equity. How much? 25%. Net worth is nothing but equity. What is return on equity ka formula? What is return on equity ka formula? Each divided by equity is equal to 25%. Sir, there is no preference dividend. We saw the balance sheet. Are you able to see any preference share capital? No. If there is no preference share capital, there is no preference dividend. If there is no preference dividend, PAT and each will be same. What is PAT? 3 lakh 75,000. Same thing will become each. Equity we don't know. This is 25%. So solve and you will get equity how much? 15 lakh. Okay, na sir. How do you get equity? What put together is equity? Equity, share capital and reserves in surplus. And they have given the ratio. Share capital and reserves in surplus is in what ratio? Share capital and reserves in surplus is in the ratio of 7:3. Total net worth is 15 lakh. Equity and reserves in surplus is in this ratio. Means how do you find share capital? 15 lakh you have to distribute in this ratio. 7:3 ratio. You will get share capital and reserves in surplus. Fill it up. Share capital 10.5, reserves in surplus 4.5. 10.5 and 4.5. That means you have the balance sheet total. How much is that? No, 11 lakh, 15 lakh, 19, 21 lakh. If this is 21 lakh, that side also 21 lakh. Correct, Aji? Now, if you're getting stuck, you check which information you have not yet used. That will be the clue. So far, what have you used? Sales we used. Return on net worth we used. Income tax not yet. Share capital reserves in surplus used. Current ratio. Tell me the formula for current ratio. Current asset divided by current liability. Total current asset we don't know or not yet. What about current liability? Only one is there in current liability, which is what? Current liability, you know. Current ratio, you know. With this we can find current assets. That's your next clue. Use that and find out this. How much? 4 lakh. Where will you write? Inner column or outer column? Current assets total. Total current assets, you will push it in the outer column. 4 lakh. Yes, Aji. Correct, Aji. Next, what information we can use? This also used. Net profit to sales pending or used? Used. Next, inventory turnover ratio. Now, anywhere in the problem they gave opening stock. Because to find average stock, we need, how do you get average stock? Opening stock plus closing stock divided by 2. Opening stock given. Any average stock given. That means in this problem, average stock we can find or we cannot. If you cannot find average stock, what is the next best you'll use? So therefore, inventory turnover ratio ka formula is what? COGS divided by average stock or closing stock? Closing stock. And do you know COGS? How much? 18 lakhs. So use this information. Inventory turnover ratio is 12 and COGS is given to be 18 lakh. You can use that and find closing stock. Inventory turnover ratio is 12. Inventory turnover ratio ka formula COGS divided by closing stock. COGS is given to be 18 lakh. Closing stock you don't know is equal to 12. Therefore, closing stock how much? 1,50,000. Any problem? So closing stock we got it as 1.5 lakh. And now, so total current asset how much? 4 lakh. These two if you add you are getting 3,50,000. Therefore, cash we have to calculate or balancing figure. How much? 50,000. That's all. Done now. Fixed asset I don't even have to bother. Total asset is how much? 21 lakh. In that total assets 21 lakh, if current asset total is 4 lakh means fixed asset total has to be calculated or balancing figure. If you want each balancing figure also, you can put a working note. Like total asset is equal to fixed asset plus current asset. Total asset is 21 lakh. Current asset is 4 lakh. Therefore, FA is equal to 21 lakh minus 4 lakh, which is 17 lakh. Like that also you can do, or simply write balancing figure. Because these are lengthy problems. You will not be able to put every working note. Even if I say wants to take away 1 mark, let them take. Mother body, no, learn to donate. Let us not worry. Our point is to finish the question in time. 1 or 2 marks if you're losing for all this balancing figure, let them take. No problem. Everyone enjoy. We are not greedy. We are okay with 60, 65, no. 70, enough, no. More, 80, now okay, 80, 20 marks you donate, pa. Enough, no, they're saying 40 also enough, sir. Okay. Problem over, Aji. Hey, they asked operating expense, macha. You forgot about that, no? How to find? Tell me the equation again. Sales minus COGS is GP. GP minus operating expenses, EBIT. EBIT minus interest, blah, 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 blah. Now you will get operating expense. When you put up income statement, operating expense, you will get it as balancing figure. That's what we have done here. Check. Sales, so missing a given now. Sales given, COGS given. Sales minus COGS will give you GP. GP minus operating expense gives you EBIT. EBIT we don't know. But do you know net profit? Everyone check. Do you know net profit? How much is that? What does net profit mean? PAT. So PAT is 3,75,000. We got it. Now one information they told, tax rate is 50%. Sir, if tax rate is 50%, suppose profit before tax is 100. And if tax rate is 50%, what will be tax? If profit before tax is 100 and if tax is 50%, what will be tax amount? 100 ka 50%, which is how much? 50. Therefore, PAT also will be how much? So that means what is the conclusion I'm saying? If tax rate is 50%, these two amount will be different or same? If tax rate is 50%, these two amount are same. So if this is 375, tax also will be 375. Correct, Aji? Now, how do you get EBT then? Deducting these two or adding these two? Adding these two, you will get 3 lakh or rather 7.5 lakh. Interest missing a given. So that means how do you get EBIT? 750 plus 60 you will get 8 lakh 10. Now this 42 lakh, this 8 lakh 10. Operating expenses, balancing. That's what they asked. Getting it?
Yes.
Pakka na. Simply putting up an income statement, whatever data is there, update, you will get operating expense as balancing figure. But don't forget, tax rate is 50%. Andre, these two value will be same. That is the clue. Once you have figured out this, all others will go on getting as balance. You can go on calculating and the problem should be over. Yes, Ajay. Yes, Ji. Next one, Ajay. Sir, how many more? I wanted to 2 more. You tell me how many more you are ready to absorb. 2 more. Pakka na. Ready. Right. Fine, sir. Question. He is saying no, sir. I know. So from 12:30 you are looking at door now. So your feelings I can understand. So it is okay. I'll not even bother asking you. Yeah, no, I do understand. It is tough because you're sitting from morning 7. No, it's already been 2 o'clock. Papa. Yes, no, it's not easy at all. I do appreciate that you have come on time and you have stayed this long and trying to be as attentive as possible. That only I appreciate. I know it's very difficult. And that too, this is one-way traffic, no? At least normal class mein, at least we can aram se chit chat, we can do when you're bored, or we can tell some story, we can put some blade, something we can do and kind of bring your attention back. Here marathon means already time. Here also I can tell story, but I feel bad for the recorded guys. Because I know that they'll watch marathon and all on the examination day. Now if I start saying once upon a time in articleship, they will be like, hey, dabba fellow, finish and go da. This guy is looking at door from 12:30. They will be looking at door from starting only. So I don't want to stretchify marathon. So only subject related content we will focus on here. Now, from the, correct macha. From the following information of Lakshmi Private Limited, you need to again prepare what? Summarized balance sheet. One good takeaway will come from this question. Because of that, this question is an LDR. Anyway, here no point in talking about LDR. Net working capital, how much? 480. Bank overdraft, 80. Bank overdraft is a current liability. Fixed asset, it's not proprietary ratio, it should be proprietary funds. Fixed asset divided by proprietary funds, if you do, you will get 0.75. We'll see. Reserves and surplus 320. Current ratio 2.5. Quick ratio 1.5. Now people in leverage, leverage there was a connection. What connection? Financial leverage and interest was a connection. Here also in ratio, 2 connections you will mostly see in exam question. One is net working capital and current ratio. If they give you these two, automatically you can start working note number 1. How? Sir, net working capital how much? 480. How do you get net working capital? Current asset minus current liability. And they've also given current ratio. How do you get current ratio? Current asset divided by current liability. First, check this. It's a pure substitute. What is current ratio? 2.5. So with this, we can find current assets and current liability. Current ratio is given 2.5. Value they have not given. But we know current ratio is current asset divided by current liability. Therefore, when you cross multiply, can I say current asset is 2.5 times of current liability? Done now? Okay. They have given net working capital how much? 480. How do you get net working capital? Current asset minus current liability is 480. Now I will not write current assets. Current asset I will substitute with, how much is current asset? 2.5 times current liability. Instead of current asset, we will write 2.5 times current liability. Minus current liability is 480. Solve and you will get current liability 320. Therefore, what will be current assets? 2.5 times of this number, which will be 8. Hence, this is a good connection. What connection is this? Current ratio, net working capital. When they give you this, automatically you can find current assets and current liability. Done now? Now, if they give you current ratio and quick ratio, that is also a connection. What ratio? Current ratio and quick ratio. This is also a connection. Using this, you can find closing stock. How? Is quick ratio given to you in the problem? Check. is quick ratio or liquidity ratio given to you in the problem. How much? 1.5. Quick ratio, what is the formula? Quick asset divided by current liability is 1.5. How do you get this quick assets? From current assets, you have to reduce closing stock. Prepaid expense will not be there, leave that out. From current asset, if you reduce closing stock, you will get quick assets. Divided by current liability is equal to 1.5. Correct? Current asset, you know. Current liability, you know. Quick ratio, you know. What is the only thing balancing figure? Closing stock. Solve and you will get closing stock as balancing figure. So hence these two are connection. The moment you find this, you don't have to even read the other things. Go ahead and update this. Fine, now people. Now we'll figure out what are the other things to do it. Now at least whatever components we have got, we can fill it up. No, total current liability we got how much? 320. Go to the balance sheet and fill it up. This is 320 lakh. Inner column, outer column. Total current assets how much? 8 lakh. Inner or outer? Outer column 8 lakh. Done now. And then what did we get? Closing stock. How much closing stock? 3 lakh 20,000. 3 lakh 20 closing stock, outer column or inner column? Inner column. Done. So far this much data we have captured and updated. So let's come back to the problem. What else is given? Let's put a tick of whatever information. Where are you going to? What and all information we have used? First tick. Net working capital we used. Yeah. Current ratio we used. Yes. Quick ratio. Yeah. Now see, bank overdraft is given. Bank overdraft is part of current liability. Can we go ahead and finish? Update it off. So 80,000 bank overdraft in outer column or inner column? Usually they will not give any other information about current liability. Total is 320. In that bank overdraft is 80 means others will be 240. Calculated or balancing figure? Balancing figure. That is done. Okay. Next, this is also used. Next, what is the information we have not used? Reserves and surplus fixed asset divided by proprietary funds. No problem. We'll try to use this. Give me an equation of this. Equation of this you give me. Fixed asset divided by proprietary fund is equal to 0.75. Therefore, what is fixed asset? Fixed asset divided by proprietary fund is 0.75. Therefore, fixed asset is 0.5 times proprietary fund. Do you agree with me? Now, people, everyone observe. How do you get proprietary funds? We have already discussed. Proprietary funds means owner's funds. Who is the owner? Only equity shareholder or also preference shareholder? So tell me proprietary funds ka formula. Equity share capital plus reserves and surplus. This is for equity shareholder plus preference. This is one way. Clear? There is another way to calculate same proprietary fund. This is from the equity liability side. You can also calculate proprietary funds from the asset side. What is that? Is FA plus net working capital minus long-term debt. FA plus what? Net working capital minus long-term debt. This is another formula to calculate proprietary funds. If you don't believe me, check. I proved it to you. Let's take a simple balance sheet. I've assumed this number. All these numbers simply have random numbers I've assumed. Calculate proprietary funds for me here. Normal may calculate proprietary funds. How do you calculate proprietary fund? Equity share capital, reserves and surplus, preference share capital. How much? 15 lakh. Yes, sir. That is a normal way of calculating proprietary fund. How much you got? 15 lakh. One more formula just now I told. Tell me what is that? Fixed asset plus net working capital minus long-term debt. Fixed asset. Okay. How do you get net working capital? Current assets minus current liability minus long-term debt. Do that. 15 lakh plus, how do you get net working capital? Current assets minus current liability. Or maybe I'll just write it here. Fixed asset plus net working capital is current asset minus current liability minus long-term debt. 15 lakh, this will be what? 3.5, minus 3.5. How much are you getting? 15 lakh. You got a different answer or same answer? Same answer. Proved. So we have to use this particular equation. Okay, rather this. Current asset minus current liability is what? Net working capital. So therefore, I'm using what equation to get proprietary fund? Fixed asset plus net working capital minus long-term debt. I proved it to you. Whether you do it normal way or this way, answer is same. Now, why am I using that? This equation is net working capital in this problem missing or given? Given. Proprietary fund and fixed asset, they've established some connection in this problem. Just now we read. Long-term debt not given, so it is 0. So we can solve this equation to get fixed asset and proprietary fund. If you want, just check. I'll maybe show you the solution. Fixed asset divided by proprietary fund is how much they told in the problem? 0.75. Therefore, fixed asset is what? 0.5 times proprietary fund. Now, they told, or rather, how do you get proprietary funds? Through another way, not the normal way, another way. Fixed asset plus net working capital minus long-term debt. Okay, proprietary funds, PF, I'll write it as it is. Instead of fixed asset, I will substitute. What is that? Instead of fixed asset, we will write 0.75 proprietary funds. Net working capital missing a given how much? 480. Long-term debt not given 0. So solve this equation and you will get proprietary funds 19,20,000. Easy. If you know proprietary funds, you can find fixed asset. How much is that? 0.5 times proprietary fund. When you solve, you will get fixed asset 14,40,000. So don't forget this equation. Okay, now people. Whenever they say proprietary funds, 2 equations should come to your mind. What are those? Equity share capital, reserves and surplus, preference share capital. One way. Another one, fixed asset plus net working capital minus long term. You check if they have given direct information, use direct equation. If they have given net working capital, use this particular equation. Fine, now people. Now what and all we got here? We got fixed asset. Proprietary fund is okay. Fixed asset, where it will come? Balance sheet. 14 lakh, how much? 40,000. Fixed asset, you know, current asset total, you know. That means you also know. Total asset side. What did I say? The moment you write one side total, update the other side total also. Correct now? In this problem, long-term debt, preference share capital there or not there? Not there. Reserves and surplus there. Reserves and surplus there. Yeah, reserves and surplus is given how much? 3,20,000. Update reserves and surplus. How much? 3,20,000. This is given. That means equity share capital, either you can put up a working note or get it as a balancing figure. If you want to put it as working note, very simple. Okay, how do you get proprietary funds? Normal way for proprietary fund. Equity share capital, reserves and surplus, preference share capital. How much is proprietary funds ka total? 19,20,000. 19,20,000 is equal to equity share capital plus reserves and surplus given 320. Preference share capital not there, so 0. Solve and you will get equity share capital 16 lakh. Either like this or get directly as a balancing figure, your choice. Fine now. So the takeaway of this question is proprietary funds. Another way to get proprietary funds. That's the takeaway, a good takeaway from this question. Done na people? Pakka na people? Why are you smiling people? Okay. Class over, No sir. Yo, class if it was over means we'll be smiling big time, sir. And now, last one. Chudama. Ashte. Looks like whatever dialogues we give in class will come back to us one day, no? We should be a little careful what we use, huh? Yeah, we will use and we will forget. Later it will come back to us. Yeah, nice. Good that you guys remember. Thank you. Now people, next, question number 30, no? People, this question, no? I think I had one more to do, but I think I will just discuss this. You tell me this one. Operating ratio is 85%. What should click? Operating ratio means COGS plus operating expense put together is 85% of sales. Therefore, EBIT is 50% of sales. Clear? This is the takeaway of this question. And COGS and operating expense also they have linked. Using this, you can find out COGS and operating expense. Can you solve this question? Manageable? I plans to do this so you can manage this. Okay, fine. Or if you want, after this question, I'll ask once again. 5 more minutes if you are ready to spend, we will solve that question also. Otherwise, we will leave. Your call. Now, people. One more question. Mannan Limited ante. I think this is also a study material question. Lot of data given means, first, sir, when they give you percentage and all, ignore. Check which component they have given value. Any value? Net working capital, waste. Because net working capital is current asset minus current liability. I want individual component value. Any individual fixed asset or good. Okay, one I know. Then opening stock they have given. That means if opening stock is given, I can find average stock. That means inventory turnover ratio, I should not use closing stock. I should use average stock. That should click. Fine. So that means only information right now which is probably helpful to me is fixed asset. Okay, looks like I'm not able to proceed. Check go, is fixed asset linked with any component? Doesn't look like. Doesn't look like. Okay, now identify which component is linked multiple times. Total asset turnover, total asset, total asset, total asset, total asset. Yes. How do you get total assets? Fixed asset plus current. If I just find current asset, more or less I think problem is over. Okay, na sir. And now let's see. How can I find current asset, people? Go for your normal connection. One way an examiner will link is they will give net working capital and they will give current ratio. Given a current ratio, net working capital. Congratulations, you got current asset and current asset. Both. Once you know current asset, you already know fixed asset. So you can find total assets. And they have given return on total assets. So you can find PAT from this. Total asset turnover ratio, you can find sales from this. They have given GP. GP is 20% of sales, means COGS is 80% of sales. From COGS, you can use inventory turnover ratio and find average stock. Use that from opening stock and find closing stock. Problem over. That's all as a linkage. Okay, now. First find always which value given. Not the ratio, not the ratio. You don't have to mug up all this. If you mug up, because next May they will substitute this with something else. So these are mathematics. You cannot mug up this. They'll keep substituting. So you can only establish a pattern. First, which value? Which value? And is that value linked with any ratio? Linked with any number? If that is not there, see if any number is linked multiple times. That will be the common clue. And then some common pointers. Common pointer is current ratio, working capital, they will link. Then they will give you current ratio, quick ratio. These are some common pointers. Think on those lines so you can solve these questions faster. That's the only way. Correct, people? And now, how do we proceed? Now you guide me. We have already discussed. Give me the guidance. First, to net working capital and current ratio we will link and find out what from this. Current assets and current liability. Should I have to take you through that or substitute, you know? So current liability you got 9 lakh, current asset you got 22.5 lakh. Fixed asset is already given, current asset you got it now. Using these two we can find total assets. Fixed asset given 30 lakh, current asset 22.5. So total asset is 52.5 lakh. So far okay now. Now check total asset is linked with what and all. They gave return on total asset is 15%. Return on total assets. Now return on total assets, there are two formulas. One EBIT into 1 minus tax rate divided by total assets. Another one PAT divided by total asset. Both two formulas are there. I told depending on what you need to find in the information, use. Check the problem. They asked what? Last line check. EPS. For EPS, we need EBIT now or PAT is more suited. That means which formula we will use for return on assets? PAT. Correct? That means I will use PAT ka formula for return on assets. What is PAT ka formula? PAT divided by total assets. Is this missing or this is given in the question? Given as 15%. So use that. Return on total asset is 15%. PAT divided by total asset is 15%. Total asset we have. So from this we can solve and get PAT as how much? 7,87,500. Need a minute or okay? Done. So this is sorted. Next, what else they have linked with total assets? Total asset turnover ratio. How do you get total asset turnover ratio, people? Sales divided by total assets. Total assets, you know. Total asset turnover ratio is 2. So total assets, you know. This, you know. Sales, you don't know. Solve, we will get sales to be 105 lakhs. Done now. Now sales, they would have linked with GP, NP, COGS, whatever. Check what they've linked. They told what in the problem? GP is 20%. Sir, if GP is, when they give you 20%, it is always 20% of sales. If GP is 20% of sales, COGS will always be 80% of sales. I mean, moment you know sales, two things we can find, GP and COGS. Find that. GP is 20% of sales, COGS is 80% of sales. Sales ka 105 ka 80% is 84 lakhs. That is your COGS. Done. Now, what and all information we have used and what are yet to be used? Current ratio we used, yes. So then return on assets we used, yes. This one, yes. GP, yes. And what about stock turnover ratio? Used or not yet? This is your inventory turnover ratio. Let's use this. What's the formula? COGS divided by average stock if you can find. Otherwise, closing stock. But here opening stock is given, no? If opening stock is given, we can't find average stock, or we can? We can. That means what is inventory turnover ratio ka formula in this problem? COGS divided by average stock is equal to how much? Inventory turnover ratio is given to be 7. COGS we just now solved 84 lakh. Using this you will find, get average stock. How much is average stock? 12 lakh. Any problem? What is a normal way to find average stock? Opening stock plus closing stock divided by 2. Average stock you know. Opening stock they only given in the question 11 lakh 40,000. Closing stock you don't know. Solve this equation to get closing stock to be 12 lakh 60,000. Okay na sirji? Any problem sirji? Need a minute sirji? No sir. Please leave sir. Okay. Okay. Stock turnover ratio is 7. Sorted. Net working capital. I think we already used this. Fixed asset. We already used this. Equity shares. So 1,80,000 equity shares of how much each? That means equity share capital, can I say, is 18 lakh? Okay, we'll see. 60,000 preference shares of 10 each. That means preference share capital is 6 lakh. So in this problem, preference shares are there. Okay, these two we'll see what to do. First of all, what did they ask? Quick ratio. What is formula for quick ratio? Current asset minus closing stock divided by current liability. Current asset you know, closing stock you know, current liability you know. That means this one, any trick, difficult or easy? Substitute, straightforward. Fixed asset turnover ratio. What's the formula? Sales by fixed asset. Sales you already found out. Fixed asset they only given 30 lakh. That means this is also straightforward. Done now. Correct. So these two plain. I don't have to show you that. It's sorted. Proprietary ratio people. Proprietary ratio people. Come. Book macha. You take what and all you need. I will give you everything. You got iPad, proprietary ratio. How do you get proprietary ratio? Proprietary funds divided by total assets. And how do you get proprietary funds? Equity share capital plus reserves and surplus plus preference share capital. Sir, given no sir, add sir. Hey, don't add. Reserves and surplus given are missing now. Sir, assume 0 sir. We can assume 0. But hang on. Check, have you used all the information in the question? Second line mein what they told? Did we touch that? Did not even read. Okay. Debt equity ratio. Let's see if we can do something with this. Tell me the equation format of this. Debt divided by equity is equal to 1 divided by 1.5. Correct? Okay. Equity ka value you know. Sir, equity means equity share capital and reserves and surplus. You know equity share capital, reserves and surplus you know or you don't know. So let's at least try to substitute. They gave debt equity ratio as 1 divided by 1.5. When you solve, what you're going to get? Equity will get multiplied here, debt will get multiplied here. So equity is what? 1.5 times of debt. Correct, Aji? Okay. Now, did it land us anywhere or still stuck? Because we don't know reserves and surplus. Correct? We still don't know. Now, whenever you are getting stuck after reading all information, if you are not able to proceed at all, means one God equation is there. God level equation. Remember that. Balance sheet. Total asset will always be equal to total equity plus liability. If nothing is clicking, that will click. Pakka. Okay. God level equation. It will always click. What is that again? No? Total asset is equal to equity plus liabilities. Yes, sir. Total asset may we need fixed asset, current asset. Do you know? Yeah. How much? 52 lakh 50,000. Equity people. Equity means equity share capital and reserves and surplus. But for the time being, we have a linkage between equity and debt. So I will not write equity and reserve, equity share capital, reserves and surplus. I will keep it as what? Equity. I'll keep it as equity. So that means tell me what and all components can come on the liability side of equity share capital or reserves and surplus. These two put together becomes equity plus preference share capital plus long-term debt plus current liability. Now instead of equity, I will substitute. What is that? 1.5 times debt. Because that's the reason they gave you this equation. Equity is 1.5 times of debt. Debt we don't know. I'll keep it as it is. Preference share capital missing or 6 lakh? 6 lakh. Current liability we already got. How much we got current liability as? 9 lakh. So that we have got. Everything we have now. You just have to solve this equation to get the debt. How much is the debt value? 15 lakh. Any problem, people? Just give you a minute to observe this. This is just balance sheet equation. Total asset is equal to total equity plus liability. Don't write equity share capital plus reserves and surplus. Why? There is a linkage between equity and debt. Equity refers to equity share capital and reserves and surplus. We want to use this link. So hence, instead of equity share capital and reserves and surplus, we have written equity. Because we can substitute this on what terms? On debt terms. So when you solve, you'll get as debt as 15 lakh. If debt is 15 lakh, what will be equity? 1.5 times of debt. Do 15 lakh ka 1.5 times? 22.5. Done now. And how do you get equity? How do you get equity? Equity is net worth. How do you get that? Equity share capital plus reserves and surplus or retained earnings. Equity is 22.5. Equity share capital was missing or given? Given. We have already told now in the question only. How many shares we have? 1,80,000 shares of 10 each. Therefore, equity share capital how much? 18 lakh. So, equity is 18 lakh. That means when you solve, you will get retained earnings 4.5 lakh. Yes, sir, people. Therefore, you can't assume reserves and surplus 0 because we do have value. Okay. That's all. Clear? No. Now, you know equity, equity share capital, you know retained earnings, you know preference share capital also. Can't you find proprietary funds? How do you get proprietary ratio? Equity share capital, reserves and surplus plus preference share capital divided by total assets. All these three components you have found out. So proprietary ratio will be straightforward. Last one, EPS. How do you find EPS? Each divided by number of equity shares. Now you already know PAT. How much is PAT? You already solved. PAT is how much, people? 7,87,500. So there is no preference dividend. PAT is same as each, sir. Preference share capital is there, macha. Here, how much? 6 lakh. They gave in the question. What percentage preference shares? 9% preference shares. Preference share capital is 6 lakh. So preference dividend not there or there? 6 lakh ka 9%. How much? So to get each, what do we do? From PAT, we have to reduce preference dividend. PAT, we have already got it here, 7,87,500. From that, reduce preference dividend. And number of equity shares, they only told 180. Solve and you'll get the EPS. That way, good question. Okay. So what is the takeaway of this question? One, no, if you are full stuck, everything you have used, if you are still stuck means balance sheet equation. Another point you can add. So far, what are the common pointers we have found out? One common linkage is net working capital, current assets. Second one is current ratio and quick ratio. That is one. Then proprietary funds ka one normal way is equity share capital plus reserves and surplus and preference share capital. Another way, fixed asset plus net working capital minus long-term debt. Okay. Write the current assets on the outer column. Total components in the inner column. And when you know one side of the total balance sheet, fill up the other side also. And check which component is linked multiple times. Nothing is working, God level equation. Somewhere in this, you will be able to figure out the answer. Okay, now, I don't think so. Still, you will be stuck there. Somewhere around this, you will be able to solve. I think these are good common pointers for ratio. Now, last question. What do you want to do? Do or skip? Do means 10 to 15 minutes. Skip means skip. May 24 wala question. Your call. Do me quickly, majority opinion. Election time, I'll take majority. Do. Okay, do. It's not democracy, sorry, macha. Lastly, I checked it was that only, no? I don't know. We're in North Korea now. Okay, the theme limited guess given following information, no? 12.5% debt. 12.5% debt. When they give you percentage, always what should click? Interest. Debt value is given how much? 45 lakh. Therefore, how much will be interest? 45 lakh ka 12.5%. Interest is 5 lakh 60 to 500. Somewhere we may have to use this. Let it be. Now, people, debt you already know. They've linked debt with equity. That means if you know debt and if you know debt equity ratio, using this, what we can find? Equity. Let's find this. We'll go there only. So, if you do, first of all, what did they ask in the question? And you need to calculate few things. Interest coverage ratio they have asked. For that, we need interest and EBIT. They have asked gross profit ratio. We need for that GP and sales. Then they have asked current assets. Since they are asking multiple components of income statement, let me have the income statement and then we'll figure out the other things. Okay. Now, debt you know. Debt divided by equity, if you do 1.5 is to 1. Solve this equation. You will get equity. Where is it? Where it went? Here. Debt divided by equity is 1.5 is to 1. Debt is given to be 45 lakh. 45 lakh divided by equity is 1.5. Therefore, equity is how much? 30 lakh. So, first equation, I think we have used this. Yes, no? Let's put up, take this used, this used. Next, return on shareholders' funds. You can call it as return on equity. You can call it as return on net worth, or you can call it as return on shareholders' funds, one and the same. How do you find return on equity? Each divided by equity. Equity you already know. Equity you already know. Return on net worth also you already know how much? 54%. That means with this you can find what? Each. If there is no preference dividend, PAT to issue, both will be same. Okay, now. So let's use this equation. Return on equity is 54%. Return on equity is 54%, means the formula for return on equity is each. If you quickly want, you can just check. Is there any preference share capital in the problem? Check. If there is no reference given to preference dividend or preference share capital, that means preference share capital is 0. If preference share capital is not there, preference dividend also is not there. So that means PAT and each will be same. So that means return on equity, either you can write each divided by equity, or in this problem you can write PAT by equity, because both will be what? Same. So now this we don't know. Equity we found out. How much is it? 30 lakh. This return on equity, they only told 54% or 0.54. So when you solve, you will get PAT to be 16 lakh 20,000. Done now. Income statement format, tell me. Sales minus COGS, GP. GP minus operating expense, EBIT. EBIT minus interest, EBT. Less tax, you'll get EAT. Now you already got PAT. How much is that? 16 lakh 20,000. Update that. 16 lakh 20,000. Got it? Okay. Now people, I'll be very happy if tax rate is 50%. If tax rate is 50%, this number will be same. Is it? Oh, Jai Allah, Jesus, Shiva. Ayyo. Ooh, disappointment. It is 25%. Okay, no problem. We'll come to that. At least we will see anything else we can use. Operating ratio, how much? 85%. Sorry, if operating ratio is 85%, means EBIT will be 15%. Now what? Sales. If you know EBIT, we can find sales. If you know sales, we can find EBIT. One of the things we can find out. Then operating expense and COGSO, they have linked. Okay, they have some linkage. Tax rate 25%. Fixed asset 39 lakh. Current ratio 1.8 is to 1. No. Current asset we know. No. Current liability do we know? No. Net working capital given? No. Okay, that means invariably I'll have to end up using this only. Tax rate is how much? 25%. What is that? Simple. Oh? Sir, if earnings before tax is 100, EBT is 100, what will be the tax? Tax will be, tax rate here is 25%. No? So 100 ka 25%. How much? 25. So therefore earnings after tax will be 75. Any problem? Okay, now check. I'll express this in equation. No? EAT, EBT. EAT, EBT. If earnings after tax is 75, earnings before tax will be 100. Agreed? Now in this problem, earnings after tax is missing or we have found? What is earnings after tax or PAT we have found? 16 lakh 20,000. If this one, if earnings after tax is 16 lakh 20,000, andre, how much is earnings before tax? That wala proportion. Okay na? How much is this? 16 lakh 20,000 represents 75%. Or if you don't even have to do all this. 16 lakh 25,000 is after tax. No. After tax, how much tax are you paying? 25%. That means 16 lakh 20,000 represents 75%. We want earnings before tax. Earnings before tax represents what percentage? Per 100%, how much? So into 100 by 75, how much? 21 lakh 60,000. That is your earnings before tax. Done, Aji. This you know means what is the tax amount? Either you can calculate 21 lakh 60,000 ka 25% or you can do these two ka minus. Your choice. How much is that? Huh? 5 lakh 40,000. We filled out interest we need. Always no people, income statement. No, don't keep it like that. First fill out all the data. Okay. First you write from sales till PAT. First you write the format. Have one working column here only. If it is simple working, we'll do it here only. Like the way we used to do it for leverage. If it's a bigger one, we'll put a separate working note. Now, when you have already the format, you'll know, you'll accordingly go on filling. I think they had given debt. Debt is how much? 45 lakh. What is the interest rate? So interest is missing or interest is 560 to 500. So go ahead and fill up the interest. How much is that? 5 lakh 60 to 500. EBT is 21 lakh 60,000. Interest is 560 to 500 means what is EBIT? These two ka addition, which is 27 lakh 22 500. Congratulations, you know sales. How? You know sales. How? They gave a ratio. What is that ratio? They told operating ratio is 85%. If operating ratio is 85% means EBIT will be 15% of sales. You know EBIT? That means you can find what? Sales. That is the next equation. Next working note. Sales. Operating ratio is 85% of sale. Therefore, EBIT will be 15% of sales. So, EBIT is basically 0.15 of sales. EBIT just now we found out. How much is EBIT? 27 lakh 22 500. Therefore, sales will be these two ka division, which will be 1 crore 81 lakh 50,000. Go ahead and fill it up. This also got it. Okay, na Sarji. And now check what else information they have given which we can use. Did we use this particular information? Now, operating ratio we used. I think they have linked COGS with operating expense. Tell me what is the ratio equation format may express this? This one. Operating expense divided by COGS is equal to 2:6. That's what they have told. Okay, let's substitute, see what we'll get. Operating expense divided by COGS, you will get 2:6. Operating expense, you know, not yet. COGS, you know, or not yet? Not yet. At least let's do cross multiplication and see what we'll get. 6 will be multiplied here, 2 will be multiplied there. So 6 times operating expense is equal to 2 times COGS. So therefore, what people? COGS will be 6 divided by 2. What is that? COGS will be 3 times of operating expense. Any doubt in this so far? No? You can use one more equation. Once we have used, we can use it one more. Can you tell me what is that? Operating ratio was how much? 85% of sales. Because operating ratio was 85% of sales, we told EBIT is 15% of sales. Operating ratio means what all put together? COGS plus operating expense put together is 85% of sales. Correct? Huh? Operating ratio means COGS plus operating expense is 85% of sales. We'll use that equation once more. COGS plus operating expense is 85% of sales. Instead of COGS, we'll substitute. What is that? 3 times operating expense. Operating expense, I'll keep it as it is. Sales, you already know. Sales ka 85% will be this number. So now when you substitute, you will get 4 times operating expenses this number. Therefore, operating expenses that number. Give you a minute, observe. This is also one hidden adjustment. We have to use it properly. Okay, na sir? Sir, if you know operating expense, you know COGS also, because COGS is how much? 3 times operating expense. So multiply by 3, you will get COGS. COGS you know, operating expense you know, go ahead and fill it out. COGS we got it, operating expense you got it. Sales minus COGS is GP. That means anything number pending or all ticked. All ticked. Now the requirement, what did they ask? Chiller pillar thinks so. Interest coverage ratio. How do you get interest coverage ratio? EBIT divided by interest. EBIT divided by interest. These two you divide quickly. Or leave. Number is 4.84. Anyway, all the data we got. Next, they asked GP ratio. Faltu. GP by sales into 100. Next, what they asked? Next to people, they asked current assets. Current assets. Oh, current ratio they gave, but net working capital not given. How can I find current ratio? When you are fully stuck, I told what? God level equation. God level. Tell God level equation. Total assets will be equal to total equity plus total liability. Total assets mein what is the breakup? Fixed asset plus current asset. Wait. Current ratio is given, no? Used or not yet? Let's use it. Current ratio is current asset divided by current liability is 1.8. Therefore, can I say current asset is equal to 1.8 times of current liability? Yes, sir. And now tell me God level equation. Total asset is equal to total equity plus liability. Breakup you give me. Instead of total asset, we'll write fixed asset plus current asset. Breakup there is equity plus debt plus preference share capital plus current liability. Fixed asset given. Instead of current asset, I will write 1.8 times current liability. Equity we already know. Equity and debt, they are only linked. We have already got it here. Equity is 30 lakh, debt is 45 lakh. Given. So equity, debt to given, no, added up. Preference share capital, any reference or no reference? Current liability, I'll keep it as it is. Because current asset, now I've expressed in current asset format or current liability. Now this is, solve this equation and you will get current liability how much? Understood? If you have current liability 45 lakh, what will be current asset? 1.8 times 45 lakh ka 1.8 times 81 lakh. Done na ji? Pakka na ji? Okay. I think these are good enough. 1 minute. I had written some common pointers in class and just show it to you. It might help you. This one, I think this you're comfortable. Write current assets, current liability in the inner column. Accounts receivable means debtor and bill receivable put together. What is one more way to find proprietary funds? Fixed asset plus net working capital minus debt. I've just given question reference where and all we have used that. That's okay. These are question numbers from our class notes. One more question is, people, they will give you 2 years ka data. They will give you 2 years ka data. In that 2 years, you will see, let's say, they will give you opening balance of retained earnings. First, they will give you 2 years data, okay? First year ka closing balance will become second year ka opening. In second year ka data will be closing balance. So basically they will give you retained earnings ka opening balance and closing balance. By looking at this, what can you make out? Can you tell me? 15 lakh has become 20 lakh. That means 5 lakh is a profit earned in the current year. So if they give you retained earnings for 2 years, you can find PAT. For which year? Current year. So what is the difference between these two? 5 lakh. That is nothing but your PAT for the current year. It's actually not PAT, it is retained earnings. But in this problem, in such problem, equity dividend, preference dividend and all will not be there. So hence, by comparing these two, automatically you will get what? Profit after tax. That's another adjustment. And you already know God level equation. And operating ratio, 85% of sales means EBIT will be 15% of sales. So, and the connection, net working capital and current ratio is one connection. Current ratio and quick ratio is another connection. So these are some common pointers we have used in class. You're taking picture, cheers. Take. Visible, till here done, Okay. Okay, now what? This is okay, na? Sorted? Yes, I think with this, we can say ratio is Completed. Thank you for your time and patience. Hello, people. Let's continue our marathon discussion. Next, now we are reviewing working capital management. So again, probably in terms of the sheer length, probably a biggest topic that is there in our FM syllabus currently, and has a significant weightage in exam as well. Usually you can expect anywhere between 6 to 10 marker to come from this particular topic. Most of the attempts it does come. Okay. All right. Let's see what we can learn from this particular chapter now. Okay. First, working capital management. So as the name is suggesting, first of all, how do you get working capital? Current asset minus current liability. So in this topic, effectively we are managing current assets and we are managing current liability. That's all we are doing over here. Why we do this is we have to manage current assets or current liability, or rather we say working capital management is a trade-off or a balancing act between liquidity and profitability. You're trying to get the balance of liquidity and profitability right. That's all is about working capital management. More about this I'll talk about in a minute. Now before that, if you want to look at working capital, you can assess it or look at it from two angles. One from time angle, one from value angle. If you are assessing from value, working capital can be defined as gross working capital or net working capital. Gross working capital means only the total of current assets. Current assets ka total if you do, that number we call it as gross working capital. Net working capital means current asset minus current liability. This is from value angle. From time angle, if you are assessing working capital, it will be permanent working capital or temporary working capital. Permanent and temporary. Permanent means, some people or many organization will maintain minimum balance of cash. Like ArivuPro maintain 50,000 cash balance every month. Will it come below that or 50 every month? So that 50,000, which is it's what, temporary or permanent number? That we call it as permanent working capital. That portion of current assets and current liability which we maintain throughout, we call it as permanent. Something which is not permanent automatically becomes temporary working capital. Okay. Next, I've written all the things in the chart book. I'll only cover the exam related things over here. Don't feel if I'm missing few things. Few theories are not that very important. So, but still I've written. So now we'll be only covering those important aspects. Okay. Now, when we said working capital, we said we are managing current assets and current liability. Why do we need to manage that? Now, if you have to say closing stock, is closing stock part of current assets? Yes. Now, what happens, people? Let's say I used to give the same example in class. So, there is a tomato vendor, tomato dealer who sells the tomatoes. Normally, he stores how many kgs of tomato? 50. But one fine day, he is starting to store 200 kgs. Instead of 50, he purchased how many? 200 kgs. So stock significantly increased from 50 it became 200. Tell me, is there any advantage due to the increasing the level of closing stock? Any advantages there? Yeah, earlier he was able to sell only how many? 50. Now he's able to sell 200. That means he'll be able to keep up the demand. If there is a demand for 200 kgs, then he can sell 200 kgs. So if he can sell more, this particular person will get more profit. Higher sales will lead to higher profit. So due to this decision, profit may increase. Advantage. At the same time, is there any disadvantage? What will happen? Sir, if he is not able to sell the tomatoes, tomato is a perishable product. So if he is not able to sell the tomato, what will happen to the tomato? It will get perished. Right now. So if this tomato gets perished multiple times, then a small business can survive or business will be shut down. That only we call it as the business shutting down risk, only we call it as liquidity risk. Now, due to this particular decision, liquidity risk has reduced or increased. Increased. Right? Due to this decision, profit may also increase, but at the same time, business shutting down risk also is increased. This particular level ka balance we are trying to maintain. We want to earn profit also, but at the same time, we don't want to take too much of business shutting down risk also. That's all is working capital management. Hence, we need to manage the current asset in the form of inventory. Similarly, debtors. Let's say people earlier we used to give a credit period of how many days? 30 days. Now we extended and made it as how many days? 90 days. Instead of giving 30 days credit to our debtors, now we are giving 90 days credit. Now debtors are sad or happy now? Happy. Earlier they had to pay us within 30. Now they will pay us within 90 days. So if you give more credit to somebody, they will buy less from us or they will buy more? They will buy more. So if they are purchasing more, rather we are selling them more. So due to this decision, what will happen to the sales? Higher sales. Higher sales will lead to higher profit. Advantage. At the same time, what are the disadvantage? Now people, earlier my fund used to get blocked only for 30 days. I used to collect the money within 30 days. My fund blockage days was only 30. Now my fund is getting blocked for 90 days. So my funds is getting blocked for higher number of days. And earlier, I used to get the money within 30 days, means my bad debt was okay. Now I have to wait for how many days? 90 days. Within, that means I have to wait for how many extra days? In that 60 days, the person may leave the country. It only takes 6 hours to reach UK. You know who? Yeah, right. So that means due to this decision, my bad debt risk has increased. Correct? No, because I have to wait longer, and within the longer duration, if debtor ka business gets affected, means my amount will become bad debts. If more and more debtors become bad, means can my business survive or business will shut down? My business will shut down if more and more bad debts, if I suffer. Yes. So accordingly, what will happen? Liquidity risk will increase. So due to this decision, there is a higher profit case also, but at the same time, there is higher liquidity risk also. So you can't blindly give credit to somebody. You will have to be a little thoughtful. How much credit to give? So you need to manage them. Fine. All right. Similarly, creditors. Now people earlier, where it went? Earlier, let's say we used to pay the creditor within, let's say 30 days. Now we are delaying the payment and making the payment on the 70th day. Creditor ka credit period is how many? 30 days. Creditor gives a credit period of only 30. Purposefully, I am delaying the payment and making it to 70th day. Creditor is asking me, what am I telling? Tomorrow. I will pakka pay tomorrow. Tomorrow again I will say, pakka tomorrow. Same dialogue. Politician I have become. Okay, na? Alright. Now tell me, due to this, is there any advantage? Earlier people, I used to pay the creditor within 30. Now I am paying within 70. That means how many extra days I am taking? That means for that 40 days, I can use this money to run my own business. By delaying the payment, I can use that money for my own business purpose. That means, and am I paying any interest on this? No. So it acts as what? Free source of finance. It's like I got money from creditor. I got a loan from creditor by paying interest or freely? Freely. So that is your one of the advantage. Any disadvantages there? Sir, if you go on telling tomorrow pakka, your words will have value or it will lose. So there will be a loss of goodwill. People will not trust you anymore. Now you are playing games, only you can play, na? Creditor also will play. Tomorrow, macha, he will say, okay. Till now, I used to supply the goods to you at 10 rupees per unit. Till now, how much? 10 rupees per unit. From now onwards, 20 rupees per unit. Yes, no, because you irritated him. Now, he is returning the favor. So, what can happen? Creditor may increase the price of the goods, or creditor may tell, henceforth, no more credit for you. Pay cash, take the goods. Otherwise, get lost. Or he may take an extreme decision of stopping the transaction with you altogether. Yes, people. So these are all some of the disadvantages. So blindly, can you delay the payment, or you need to be a little careful around it? So that means creditors also you need to manage. That is what we are doing in this particular topic. Managing current assets and current liability. Because by managing them, there is a scope to increase the profit. But at the same time, there is also some liquidity risk. Understood, everybody? Okay, next. In this particular chapter, usually around 5 to 6 varieties of question gets asked in the examination. I'm talking about 5 to 6 problems, 5 to 6 varieties of problem. Under each category, we have we have many questions. So now for each category, I will take 1 or 2 questions depending on availability of time, and we will learn. Okay, sir? All right. First is something called operating cycle. Operating cycle means what, people? You have studied, you have revised also, and then only you have come, correct? No. What is operating cycle? Chorus venda. Little louder, sometimes my hearing comes and goes. So little loud, little clear. It's a time, sir. If you are a trader, what is your main business? What will be your business? If you are a trader, not a manufacturer, if you are a trader, what you will do? Purchase the goods, sell them. Will this happen within one day or it will take some time? When you purchase the goods, you will have to pay the money. When you sell the goods, you will recover that money. That duration only we call it as what? Operating cycle. As sir pointed out, what's your name, Acha? Huh? Surya. As Surya told, it's a time gap. Operating cycle is simply a time gap between payment and receipt. Payment and receipt. That particular duration only we refer it to as operating cycle. That's what I've written over here. It's a time gap between the day you purchase the goods and make the payment till the time you sell the goods and recover your money back. That particular duration, that could be 80 days, 40 days, 140 days, 300 days, doesn't matter. That only we call it as what? Operating cycle. If you remember a regular class, I used to draw timelines and give you the example. But now let's not go into timeline. We find operating cycle through a small formula. What is that formula? R plus W plus F plus D minus C. R for raw material holding period. W for work in progress holding period. F for finished goods holding period. D for debtors collection period. C for creditors ka credit period. If you do this automatically, you will get operating cycle. Let's say operating cycle, you applied this formula and you got it as 100 assumption. 100 days. What it means is 100 days your funds are getting blocked. For 100 days your money is getting blocked. Meaning if you purchase the goods today and make the payment, you will be able to recover that money only after 100 days. Okay now? Now can I tell my employees, Macha, my money is getting blocked for how many days? 100 days. I will pay salary after 100 days. Can you tell the employee? Employee wants the salary every month. Landlord wants the rent every month. But I have money or my money is blocked for 100 days. My money is blocked for 100 days. What to do? I have to take a short-term loan. I have to take a short-term loan to run my business. That is the significance of calculation of this. Yes, sir, people. Okay, done. This is one no. Maybe I think we have a question, or maybe this also I will take up. Sir, people, again, maybe one more point too. Sir, what is the ideal operating cycle? What is the ideal number for operating cycle? 10 days or 40 days or 400 days? What is the ideal operating cycle? Is there any magic number? No. So there is no magic number for operating cycle. It depends on the business. Like if you are a builder, what do? You build the house or an apartment and sell it. Can you make the building within 1 day, 1 month or 10 days? No, that means to convert from raw material to finished goods. Your building is your finished goods, no? That process only will take 1 year. Correct? That means all this only will be how many days? More than 365 days. After that, you have to find the customer and collect the money from customer. Yes or no? That means if you are in the real estate business, your operating cycle could be really high. Maybe 400, 500, 700 also depending on the project. Because some projects are really big. You'll construct 3,000 house apartments and all that. Those are big projects. So your operating cycle may be really high, really long. But at the same time, sometimes your operating cycle could be negative also. It could be really negative also. How? Sir, if you are a supermarket, like Reliance and all is there, no? Reliance and what and all mega, what and all marts are there over here? D-Mart, Reliance, so whatever else is there. Now you tell me, will they have raw material? No, they are traders, right? They buy and sell. So will they have work in progress? No. Let's say finished goods. So they feel they will be able to sell within 10 days. If they buy the product, if they purchase the product, they'll be able to sell it within 10 days. Assumption. Will they give any credit to that? D for what here, people? D here is what? Debtors collection period. Now, when you walk into a D-Mart, you are a debtor or you are a customer. Will you get any credit or cash and carry system? You pay cash, you take the goods. So, is there any debtor credit period here or zero? Because they don't give any credit. They operate on a cash sale mode. But creditor, they may argue, since they buy in bulk quantities, they may tell the creditor, I will buy from you only if you give me 70 days credit. Only if you give me 70 days credit. Possible, no? Because they buy in huge quantities. So they will have bargaining power. Now calculate operating cycle for me. Minus 60. That means D-Mart is operating badly or good only. So operating cycle sometimes could also be negative. Just because it is negative does not mean it is bad. Okay. So you always need to analyze operating cycle, compare it with the industry. Suppose there is another supermarket, their operating cycle is 250 days. Now tell me, good or bad? Reliance or your DMart is having operating cycle in negative. But another supermarket is having how much operating cycle? 250 days positive. You expect supermarket to have a long operating cycle or short? So if this particular supermarket is having a long operating cycle, means they are doing good business or bad business? Bad business. So like this, you have to, there is no magic number. You can analyze good or bad only by comparing with the industry standard or with your competitor. Done with this. Okay, now people, one more is there. Again, I'll run you through this. If this question comes, mostly it will be for 2 marker. We have done one question in regular class. I think theory is good enough for now. There are 3 approaches for working capital investment, or you can say current asset investment. There are 3 approaches for current asset investment called aggressive, conservative, moderate. Aggressive, conservative, moderate. In conservative approach, remember because when they ask you the question, you need to know this portion alone. Okay, this portion both if you know, you'll be able to solve that question if it comes. If it is conservative approach, conservative means we want to take more risk or less risk? Less risk. So what we will do in conservative approaches, current asset we will maintain at highest level. What? We will maintain current asset at highest level because we don't want to take risk. So we will maintain high amounts of cash, etc., etc. So at conservative level, current asset will be highest. Risk, we are taking too much risk in conservative or less risk? In conservative, risk will be less. Since risk is less, return will be more or return will be less. Return will be less over here. So just remember over here in conservative approach, current asset will be highest. Risk will be highest or lowest? Risk will be lowest. What about return? Return highest or lowest? Lowest. Opposite this will be aggressive. Build the things for me. If you're following aggressive current asset investment policy, then current asset you will maintain highest or lowest? You will maintain lowest. Risk will be, you will take, since aggressive you are taking more risk. So risk will be highest, and as well as the return will be, if you are taking high risk, you will expect low return or high return? Higher return. These are the things. Okay, people, what they will give us, how the question can come is, they will give you 3 levels of current assets. They will give you 3 levels of current assets. Let's say 10 lakh, 15 lakh, 20 lakh. Now you tell me, for which policy, which current assets will hold good? They will give you, they will not tell you aggressive, conservative. They will not give you for aggressive how much is current asset, for conservative how much is current asset, moderate how much is current asset. They will only give you current asset ka amount. You need to identify which current asset belongs to which level. Now you tell me, this particular 20 lakh belongs to which current asset level? Moderate, conservative, aggressive? And conservative, you will maintain highest level of current assets. Which is the highest level here? In 10, 15, 20, which is highest? 20. That means this belongs to conservative policy. In aggressive, you will maintain the highest or lowest? Which is the lowest here? 10 lakh. That means this belongs to aggressive. Moderate means somewhere in between. Then you need to solve the questions. Okay, now people, this is one type of question which can come for 2 marks if at all they want to ask. Okay, G. Next, first type of problem is working capital estimate wala problem. Working capital estimates wala problem. Or 1 minute, let me just see if before that if I can cover anything. Or no, I think I'll do of this only, it's fine. So first type of question we are venturing into now is what, people? Working capital estimate. How do you get working capital? Current asset minus current liability. So in this problems mein, or in these set of problems mein, current assets and current liability ka components we need to estimate. What are some of the examples of current assets? Cash, closing stock, debtors, all this will not be given. We need to find out. Similarly, current liability ka components are what? Creditor, outstanding expense, etc., etc. All that will not be given. We need to find out. And from current assets, if you reduce current liability, you will get working capital. That's that wala problem. And this is one popular question I say ask for 8 to 10 markers. 1 or 2 questions can we run through first? Okay, so for that, first I'll just take you through small pointers which I've written, which you remember this format we used to follow in class. Every problem we have solved almost in the same format. in our regular class. Once I'll walk you through this format and then take up a couple of questions in this thing. Normally, first working note. Sir, it's not mandatory to follow this format. It is just that for all our problems, we have solved in same format. Hence, I would like to revise in the same format. But you are free to solve in any other way if you're comfortable also. So, first working note is work in progress. Work in progress or WIP. How do you find out WIP is? People, they will give you annual raw material consumed. No need to copy this. Just listen. We can take you through the question also. First, you need to get annual raw material consumed. It will be given to you in the question because raw material we will not sell. We will consume. For what purpose? To produce finished goods. They will give you annual raw material consumed. Now, this annual raw material consumed, is it for 1 day or whole year? Whole year. So, suppose they give you this to be, or is it okay? I'll just run you through this format right now and directly take up one question numerically than spending too much time in explaining this. Would you be okay? Okay, quickly I'll just orally take you through this now. Suppose raw material consumed is 10 lakh. Raw material consumed is how much? 10 lakh. It is for 1 day or whole year? Whole year. Whole year means how many months? 12 months. Whole year your goods will be in process. Work in progress means the time taken to process the goods. From raw material to get converted into finished goods, how much time it takes. That could be what? Maybe 10 days, maybe 1 month, maybe 2 months. But this particular 10 lakh value, is it for, let's say work in progress holding period is 1 month. How much? 1 month. But this value, how much we took? 10 lakh. 10 lakh is for 1 month or whole year? Whole year means how many months? 12 months, right? So 10 lakh is a value for 12 months. What is your work in progress holding period? 1 month. So multiply by that. You will get what? Work in progress value. Done, Aji. But work in progress means, is it 100% complete? If it is 100% complete, it is not WIP. It will become finished goods. Hence, we have to multiply by something called as DOC. DOC means degree of completion. That they will tell you in the problem. It could be 8%, 20%, 100%, whatever. Okay. If they don't give degree of completion, for raw material, we always assume DOC to be 100%. For others, we assume it to be 50%. This is a convention. If they give DOC, take that. If they don't give DOC, degree of completion in the problem, for raw material, 100%. For others, 50%. So that means you will multiply your DOC percentage, which could be 100% or whatever. Or 50 or whatever. Fine, now people. Any issues with this so far or sorted? Sorted. Okay, next. Now people, for work in progress. Work in progress means you're processing the goods. For processing the goods, you only need a raw material or you need workers also to participate. You will incur material cost also. You will incur wages and other manufacturing cost also. That we call it as conversion cost. We call it as conversion cost. So that means to get WIP, we not only need a raw material, we also need a conversion cost. Now, tell me conversion cost ka work in progress value. Same way. You will take annual conversion cost. That they will give it to you in the problem. Okay, annual conversion cost, but that will be for 1 day or whole year. So take the annual conversion cost and divide it by 12 or 365 or 52 depending on how the data is given in the question. Multiplied by work in progress ka process period. 1 month or 2 months, it will be mentioned to you in the question. Multiplied by DOC. DOC is degree of completion. For conversion cost, DOC not given means we will take it as 50%. By doing this, you will get closing stock of WIP. Okay, Sarji. Pakka. And we'll again go through this one problem also. Next, you take the cost sheet format to get the data. Not the full format. A little bit is good enough. First, cost sheet. May you start with your direct material. I know you have direct material, then you write prime cost and all. We don't need all that. Direct material consumed you start. Then labor and overheads. By adding all this, you will get your factory cost. Because I'm adding your overheads also. I don't want prime cost. It's not exact cost sheet format. I'm using that format to get what? Debtors. So first add your material consumed, labor cost and overheads. Okay. Then you'll get what, people? Factory cost. Okay. Now one thing you need to keep in mind is, sir, we do working capital estimate under a cash cost approach. What approach? Cash cost approach. Cash cost means we will take all the cost or only those costs which we are settling. Only those costs which are paid is considered. That's what we mean by cash cost. So we will include depreciation under this approach, or we will exclude, because depreciation is a cash expense or non-cash? Non-cash. So hence, whenever they give you overhead, you will include depre or exclude depre. Exclude depre, provided you are solving under what approach? Cash cost. There is another approach called total cost. There is another approach called total cost approach. In total cost approach, depre will be excluded or included? Included. By default, working capital estimate problems we solve under cash cost. We will use total cost only if the question mentions. If question specifies total cost. Otherwise, by default, what approach? Cash cost. So overheads and all will be, or depreciation and all will be included or excluded. Okay, suppose they will tell in the problem overhead cost is 60. This includes depreciation of 10 per unit. So you will take 60 or 50 now. 50. If whatever depreciation is included, first you have to exclude them and take it. Okay. So adding all this, you will get factory cost. From factory cost, what do? Add opening stock of WIP, reduce closing stock of WIP. You will get the cost of production. To this, you add admin expense, add opening stock of finished goods, closing stock of finished goods. You will get COGS, cost of goods sold. To this, add selling expense. You will get cost of sales. Okay, now people. Everybody go to people. And now, debtors is related to total sales, credit sales. So till now, what have you got? Annual cash cost of sale. But don't forget, this is a working note to find what? Debtor. Debtor is related to total sales or credit sales. So that means from annual cash cost of sale, what do we need to arrive? Annual cash cost of credit sales. Annual cash cost of credit sales. Take this number. Suppose this number is 10 lakh. Suppose this number is 10 lakh. Look at this first line. What is this? Annual. I mean, this 10 lakh is a value for, this 10 lakh is a value for 12 months. Do you give 12 months credit to your debtors? No. Let's say debtor credit period is 2 months. So what do? 10 lakh is a value for 12 months. How much for? 2 months. Accordingly, will be your debtors. Fine, people. Any problem, people? That's what I've written here. It has formula there. Take the annual cash cost of credit sale divided by 12,365 or 52 multiplied by debtor ka collection period. That way you will get the value of debtors. Done now. Correct. Now one doubt you may have, sir, this is cash cost of sale, sir. This is not sales, sir. This is not credit sales, sir. This is cost of credit sales, sir. Debtors, do we sell the goods to debtors at cost price or selling price? That means you should take sale value and get debtor, sir. You are taken here cost of sale and getting, sir. That is wrong, sir. We are solving working capital estimate. Just before this, we did operating cycle. If operating cycle is 100 days, what does it mean? If operating cycle is 100 days, what is the meaning of that? For 100 days, my funds are getting blocked. 100 days, my funds are getting blocked. Now, people, in order to sell the goods, to debtor, first we need to purchase them. You will purchase at selling price or cost price. You will purchase at cost price. So your fund will get blocked to the extent of selling price or cost price. Because you did not invest selling price. What did you invest? How much money you put in? To the extent of cost price. Hence we take cost of credit sale and arrive the debtor and not the sale value. Agreed? Everybody good? So that's how you get the debtors. Yeah, and that's what I've written over here. Okay, just tell me both the formats once, everybody. Let's see. Work in progress ka format. Tell me. Visualize. Work in progress means, is it 100% complete? No. Whatever. 40, 50, 70. It's not 100% complete for sure. It is lesser than 100. Could be 80, 70, 10, 15, whatever. Okay. To get work in progress, you need raw material also. You need labor cost also. You need manufacturing overhead cost also. Right now. Right. This labor or manufacturing overhead, we call it as conversion cost. Right. So tell me, how do you get closing stock of WIP? Take annual raw material consumed. It will be given to you in the question. That it's annual raw material consumed means it is on which platform? Whole year ka platform. Take annual raw material consumed divided by 12. Multiplied by work in progress ka process period, which will be given to you in the question. Multiplied by DOC. DOC means degree of completion. For raw material, DOC is always 100%. If it is not given. And then conversion cost. How do you get conversion cost? Take annual conversion cost divided by 12, 63, 65 or 52, how the data is given in the question, multiplied by work in progress ka process period, which will be given to you in the question, multiplied by DOC. DOC of conversion cost, if it is given, take it. Otherwise, 50% is the convention we assume. Adding this, you get the closing stock of WIP. Same way. Next working note is to find out debtors. Now debtors we follow cost sheet format. First, raw material consumed, then labor cost, then manufacturing overhead cost. Adding all this, you will get factory cost. But keep in mind, overhead cost should be excluding depreciation because we are solving under cash cost approach. Okay. From factory cost, what do you do? Add opening stock of WIP, reduce closing stock of WIP. You will get cost of production. To this, you add admin expense, add opening stock of finished goods, reduce closing stock of finished goods. You will get COGS, cost of the goods sold. Add selling expense. You will get cost of sales, annual cash cost of sales. We want cash cost of sale or cash cost of credit sales. Cash cost of credit sales. They will mention to you in the problem. They'll give you some data. Then using this as a base, get the data. This annual cash cost of sale represents how many months? Whole year. Take this number and multiply by the what? Debtors ka collection period. Accordingly, you will get the debtors. Okay. All right. Next working note we usually prefer to put as the creditor. Okay. Now, they would have given raw material consumed in the question. Raw material consumed. Now you tell me, raw material consumed is connected with creditor or raw material purchased is connected? We want annual raw material purchased, but they have given annual raw material consumed. From consumed, how do you get purchase? From consumed, how do you get purchase? It's like a COGS equation. How do you get COGS? Opening stock plus purchases minus closing stock. Cost of goods sold. Raw material you will not sell, you will consume. So instead of COGS, right, raw material consume. Now this data given, this data given, this data given, this data given. Can't you find purchase? Rephrase the equation for me. How do you get? So if you want purchase, so it will be raw material consume. Let's set closing stock you add, opening stock you minus. That's what we have written. Take raw material consume, add closing stock of raw material, deduct opening stock of raw material. What are you going to get? Annual purchase of raw material. Any problem? Now this is annual purchase of raw material. Suppose you get this to be 10 lakh. This 10 lakh is on which platform? Whole year. That is 12 months. Do we get 12 months credit from our creditors or lesser? Let's say credit period of creditor is 3 months. So what you will do? This 10 lakh is annual raw material purchase, meaning it is for 12 months. How much credit period are we getting from creditor? 3 months. Multiply, you will get the creditor value. That's what I've written here. Annual raw material purchase divided by 12, 360 or 52 multiplied by creditors ka payment period. If you do, you will get the creditor ka balance. Okay, na sir ji? These are the 3 working notes which will come in every problem. Then your estimation of working capital wala statement. Okay, sir. Now you'll have to show all the current assets. Some of the breakup of current asset is what? Closing stock of raw material, closing stock of WIP, closing stock of finished goods. Then debtor. Cash will be given to you here directly. You don't have to estimate. But don't forget prepaid expense. They'll give you some data. That prepaid expense and outstanding expense will differ on the question to question. We'll read the question, we'll figure it out. Okay, this is your total current assets. In current liability, there will be creditors and some outstanding expense. So from total current asset, if you reduce total current liability, you will get working capital. But here they also say maintain some safety margin. About this, I will take you through some problems. There could be one adjustment in safety margin also can be asked. So you just need to add safety margin as given in the question. Then you will get net working capital. That's a format. Done now. Can we take up 1 or 2 questions quickly just to apply this? No, where is it? 1 minute. This is a little big. Okay, maybe we'll take up question number 3. It's there in study material also. Look at this question. You can keep your calculator. No need to worry about your study material things. Just keep your calculator and keep calculating for me. That's good enough. Okay. On 1st January, Managing Director of Noreen Limited wishes to know amount of working capital that will be required. So you need to prepare working capital requirement wala forecast. Working capital estimate wala problem. Production during the previous year was 60. it is planned this level of activity would be maintained in the current year also. So current year also, how much are we planning to produce? 60,000. Same like last year. The expected cost to selling price are raw material 60%, wages 10%, overhead 20%. What they are saying is, of your total selling price, 60% of the selling price is raw material cost. 10% of your selling price is wages cost. Overhead constitutes 20% of the selling price. Do you know selling price? Somewhere at the end, they will give a check. What is the selling price? Sir, if you know selling price, can't you find out raw material cost per unit, wages and overhead? Check here. Selling price is 5 rupees per unit given. Therefore, raw material cost will be how much? 5 ka 60%, which is 3 per unit. Wages is 10% of selling price. 5 ka 10% is 0.5. Overhead is 20% of selling price. 5 ka 20% is 1 per unit. Figured out, huh? Alright. Next, I'll go through the questions fully once. Raw material are expected to remain in store for how many months? 2 months. So, raw material ka holding period or raw material ka storage period is 2 months. Okay, let's keep this in mind. Each unit is expected to be in process. Process andre WIP for how many months? So, WIP ka process period is 1 month given. A raw material being fed into pipeline immediately. Whatever raw material we need, we will put it in stages or full raw material one go. Means indirectly they are telling DOC of raw material is 100%. Because whatever raw material you need, fully you will put it. Not in installment. 100% you will insert before the process. Labor and overhead accrue evenly during the month. DOC given or not given? DOC, this is your conversion cost, no? Conversion cost ka DOC mentioned or not? That means we will take how much? 50%. Finished goods will stay in the warehouse awaiting dispatch to customer approximately 3 months. So, finished goods ka storage period is 3 months. Credit allowed by creditor is 2 months. Credit given to debtor is 3 months. Selling price 5 per unit. That's okay. Wages and overheads are paid first of each month for the previous month. Previous month ka wages will you pay that month only or next month? That means 1 month, can I say wages and overheads are, if there is a delay means it is prepaid or outstanding. So, we have outstanding wages and outstanding overhead for how many months? 1 month. Done, Aji? Because you are delaying this month ka wages, you are not paying this month, you are paying next month. Hence, 1 month ka wages will always remain outstanding on an average. Both wages as well as overhead. Keep cash in hand to the extent of 20,000. Safety margin or contingency, anything referred? No. Maybe it will come in next problem. Okay, Naji? Now, in some problem, work in progress will not be there. In that problems, working note number 1 we discussed in format. You can cut it off. Here we can cut it off or it is there. It is there. Okay, walk me through now. Tell me. Calculate for me. First, will you take what? Annual raw material consume. 1 minute. Do you know raw material cost? How much? 3 per unit. How much you are planning to produce? 60,000. Right? Okay. How much is the, for 1 unit raw material cost is 3 rupees. For 60,000 units, how much? 1,80,000. 1,80,000. Correct. But that 1,80,000 is for 1 day or whole year? Here, some problem people, they will give data in days, some in months, some in weeks. Here, how are they again? Months. I mean, what is the number your calculator showing? 1,80,000. That 1,80,000 is for the whole year. That is how many months? 12 months. Divide by 12. Okay. Now, multiplied by work in progress process period. Work in progress will have how much processing period they told? Work in progress processing period is 1 month. So, multiply by 1. It's as good as same. Okay. And raw material ka DOC is 100%. Multiply by 100. 100% it is. Actually not, don't multiply by 100. It's 100 by 100. How much are you getting? 15,000. Got it, huh? Everybody good? Yes. And now conversion cost. Conversion cost, they have given conversion cost or they have given breakup. We have labor also, we have overhead also. So take same thing. What is the number of units? How many units? 60,000 units. So what is your labor cost per unit? 1 minute. Labor cost per unit is how much? 0.5. Multiply 60,000 into 0.5. 30,000. That is for 1 day or whole year. So divide by 12. Right? Multiplied by work in progress process period. How much is work in progress process period? 1 month. So multiply by 1. Okay. Now DOC of conversion cost given or not given? Not given. So what is the percentage? 50%. 50% means 50 by 100 or 0.5. How much your calculator is showing? 1250. Same number. Okay. One. That's it or one more? One more. What is that? Overheads. How many units? Now we'll do it directly. How many units? 60,000. What overhead cost per unit is 1 rupee? Okay. 60,000 into 1. 60,000 into 1. That is 60,000. That is for 1 day or whole year. So divide by 12. Multiplied by work in progress process period, 1 month. Multiplied by DOC. What is DOC? 50%. Multiply 50%. Clear? So that means what is your total work in progress or closing stock of work in progress is how much? 18,700. This is the first working note. Easy, I believe. Can we get to working note number 2? Okay, G. I've taken 5 ka 60%. 5 is a selling price. Selling price ka 60% is raw material cost. That's what I've done. Or directly you can multiply by 3 instead of 5 ka 60%. In case you're wondering what is this. Okay, now. Alright. Working note number 2 is for your debtor. On debtor may you will follow cost sheet format to extent possible. First you will start with what? Raw material consumed. How many units you produced? 60,000. What is raw material cost per unit? 3 rupees. So 60,000 into 3, how much? 1,80,000. Done, Ajit. Now, only this or you have labor cost also? How many units? 60,000 units. What is the labor cost per unit? 0.5. 60,000 into 0.5. 30,000. Overhead cost. Anywhere they told overhead includes depreciation? No. If they had said overhead cost includes depreciation, what we would have done? Excluded. Here nothing mentioned. How many units did you produce? 60,000. What is overhead cost per unit? 1 rupee. So 60,000 into 1. Adding all this, what are you going to get? Factory cost. Yes, sir. To this, what do you do? Opening stock of WIP, you add. Closing stock of WIP, you minus. 1 minute. Before you take up opening stock and closing stock, you need to do a checkpoint in this problem. In every working capital estimate problem, check whether it is a new project or a new company. Check whether it's a new project or a new company. Because if it is a new project or a new company, will you have opening stock or no opening stock? No opening stock. Because if you're starting a project newly, you can never have opening stock of a raw material, no opening stock of WIP, no opening stock of finished goods. Only an existing company or an existing project can have a opening stock. Here anywhere they told this company is new company now. New project is a new project. Any reference or no reference? I mean, this is which company? Existing company. Yes. Now closing stock of WIP, you already got it. How much is closing stock of WIP? 18,750. Okay. Now in these sort of problems, people, whatever is, if it's existing company, whatever is closing stock, same thing we'll assume it as opening stock. Assume that the production happens every month same. Okay, there is no change in the production pattern. Hence, if closing stock is 18,750 means opening stock also will be 18,750. But if it is new project or a new company, will you write 18,750 or 0? So watch out for that. Okay. All right. So factory cost plus opening stock of WIP, closing stock of WIP, same number. Add it, you will get what? Cost of production. Add admin expense, given or not given. So 0. To this you add what? Opening stock of finished goods, reduce closing stock of finished goods. Now 1 minute, hang on people. Give your calculator, check the screen. What is your cost of production? 2,70,000. You will incur this 2,70,000 to produce raw material, work in progress of finished goods. Cost of production means this is the 2,70,000 is a cost incurred to produce finished goods. Correct? Now people, there are two ways they can structure the question. One, you are doing proportion, remember? You are dividing by 12 and multiplying. One is the time basis of proportioning. Another one is unit basis. Some problem they will give the data in time, some they will give it in units. Like they will say, here people, how many unit, what is the cost of production? 2,70,000. Okay, it's going a little look big. 1 minute. It's not reducing only, noda. We'll change. Okay, fine. Now it's better. Or karab. Now also or karab. Figuring a software only is taking more time, noda. Okay, 2,70,000. 2,70,000. Now, this is to produce how many units? One unit or 60,000 units? 60,000 units. Okay. Now, they will say closing stock of finished goods is 5,000 units. Closing stock of finished goods is 5,000. So, 2,70,000 is a cost to produce how many units? 60. How much for 5,000? Is this 5,000 given to you, or I am just telling? This is one way of structuring the problem. This we call it as unit proportioning. Okay, now people. Now, everybody got it? 2,70,000. Once again, I'll repeat. 2,70,000 is a cost to produce how many units? 60,000 units. Do we have 60,000 units of finished goods as closing stock, or 5,000 I have assumed? 5,000 I have assumed. Like this, you will proportion it and get the closing stock of finished goods. Okay, Ji. But in this problem, have they given this 5,000 data? Have they given units data or time data? Check. Either they will give units data or they will give you time data. In this problem, check. Finished goods, how have they given? Finished goods, they have given in units or time? Finished goods, they have given in time. That means you have to now do the proportionate in this problem in time. They may also give you units in your problem. So I explained that. Okay. And now you tell me now, same way, time proportionate you do. Can I do this in this problem? Is this applicable or not applicable? Now you tell me, how do you get closing stock of finished goods? 2,70,000. 2,70,000. Can't reduce this, huh? Ball pen na. Okay. Okay. You are able to anyway get, no, 2,70,000. 2,70,000 is a cost to produce for one day or whole year? Whole year means how many months? 12 months. Are you holding 12 months ka stock as closing stock of finished goods, or only 3 months? So multiplied by 3. How much is that? 67,500. That's all we have done over here. Clear, sir? See, you check over here. 2,70,000 is for 12 months. How much for 3 months? This is time-based proportionate. Another way is unit-based proportionate. Check how have they given and accordingly apply in the problem. So this is your closing stock of finished goods. It's a new company or existing company. For existing company, if closing stock is 67,500, opening stock also will be same. So add this, you will get the COGS. How much? Same number, 2,70,000. Add selling expense not given in the problem. So you will get annual cash cost of sale. Done, sir. Next, in the problem, they will say 80% of sales is on credit basis. 70% is on credit basis. Like that, they will mention. In this problem, any mention or no mention? That means total sale is on a credit basis is the assumption. So in this problem, annual cash cost of sale and annual cash cost of credit sale different or same? Some problem they will give you data to find credit sale, use it. In this way, not there. Done. Now we will use this to get what? Debtor. How? This 2,70,000 is a value for one day or whole year. So 2,70,000 is for 12 months. Do you give 12 months credit to our debtor, or how much credit we give to debtor? We give only 3 months. So same thing. 2,70,000, where it went? Here. 2,70,000 is for 12 months. For 3 months, how much? That's your debtor. Need a minute to process this or comfortable? Should you solve in this format only or your choice? Your choice. Just that all our question problems we have solved. Almost we have solved 10 to 12 questions on working capital management. Everything in this format only we have solved. So hence continue. Move on to the next. Now what is third working note? We need a creditor. For creditor, we need a raw material consumed or raw material purchased. We need annual raw material purchased. But we have annual raw material consumed. From consumed, how do we get purchased? Take annual raw material, consume. Add closing stock of raw material, reduce opening stock of raw material. Fine, now people. Now, raw material ka value given na, not given na? Not given. Again, you have to check. The data can be given in units or it can be given in time. If they give units, we will proportionate in units. Otherwise, we will proportionate in time. How? Very simple. Check. How much raw material did you consume? 1,80,000. This is for one day or annual? Whole year you have consumed 1,80,000 raw material. So this 1,80,000 is for one day or 12 months? 12 months. Do you hold 12 months ka raw material consumed as closing stock of raw material, or check? They told how much raw material stock you will maintain. Raw material you will maintain how much? On an average, how much? 2 months. 2 months of what? 2 months of your consumption. 2 months of your consumption, you will hold it as raw material ka stock. Okay, here they have given. So do the same thing. What is that here? One lakh 80,000 is for 12 months. What is your raw material storage period? 2 months. For 2 months, how much? 30,000. That wala proportionate. Since it's an existing company, if closing stock is 30, opening stock is also 30. So your raw material purchase will be same, 1,80,000. Any doubt? Any doubt or okay? Now this is annual raw material purchase. Annual raw material purchase. So this 1,80,000 is for 1 day or whole year? Whole year credit we will get from creditor or only 2 months? They mentioned in the problem. Credit given by the creditor is 2 months. 1,80,000 is on 12 months platform. For 2 months, how much? 30,000. That's your creditor ka value. I'll give you a minute. Just observe and ask me if you have any concerns. Fine now people. Practice. Oh, this all will come with practice. Right? Working capital estimates wala problem. Okay. Now, these are the 3 working notes. Then the final statement. Take all this data and dump it into the final statement format. Now we have closing stock of 3 things. What are those? Closing stock of raw material we know. How much is closing stock of raw material? Closing stock of raw material 30. Closing stock of finished goods 67,500. Closing stock of WIP 18,750. Take all this and put it in the format. Current assets. Then do you know debtor? Yeah, working note number 2, debtor is 67,500. Any prepaid expense in this problem or no data? We have only outstanding expense, no prepaid. Cash they only gave in the question. How much? 20,000. Adding all this, you will get total current assets. Now current liability. What and all is there in current liability? Tell me. Creditor, outstanding wages, outstanding overheads. Creditor, we got it here. How much is creditor? 30,000. Push this here. Outstanding wages. People, wages and overhead is outstanding for how many months they said? Wages, overheads are paid first of each month for the previous month. This month ka wages you pay next month. So it is outstanding for how many months? 1 month. What is outstanding? Wages as well as overhead. Okay, come back to your cost sheet. What is your total labor? 30,000. This 30,000 is for 1 day or whole year? So 30,000 is for 12 months. 12 months wages is outstanding or 1 month? So for 1 month, how much? 2,500. So that is your outstanding wages. Similarly, overheads. What is the overheads for the whole year? 60,000. 60,000 is a data for how many months? 12 months. 12 months is outstanding or only 1 month? How much is that? 5,000. That is your outstanding overheads. Adding this, you will get the total current liability. This is your total current asset. This is your total current liability. This minus this will give you excess of current assets over current liability. To this, we add safety margin. But in this problem, there or not there? Not there. So, I mean, that only is your net working capital. Okay, Sirji. And now I don't have time, so I'll explain safety margin using this problem only. Okay. Usually, I'll tell you 2 ways in which they can ask safety margin wala problem. I'll just take you through here only. We have questions on this in our regular class, but now I don't have time to go through each question because we have at least 12 questions on this. I can't take you through all the thing. As much as possible, let's try to explain here only. One way they will say safety margin is, sir, either they will say safety margin or they will say maintain provision for contingency. Something like that they will say. First, one way of structuring is they will say maintain it at 10%. How much? Safety margin 10%. That's all they will give. If they say that, take your calculator. How much is current assets total? 203,750. How much is your current liability total? 37,500. These two you minus. How much is it? 166,250. Correct? Huh? So 166,250. Or maybe I have built a different example. Let's maybe take this only. Now people, excluding safety margin, your working capital is how much? 20 lakh. How do you get this? From current assets, if you reduce current liability, you got here you told 166,650. No, that only is excluding safety margin. How much have I assumed it to be? 20 lakh. They will say in the problem, maintain safety margin how much? 10%. People remember the heading. What is the heading of this? Estimation. It's not pakka number. It's a estimate. Your estimates will be pakka or it can go wrong. It can go wrong. So hence they are saying as a safety purpose, whatever working capital you have arrived, maintain a little extra. Maintain a little extra as what? Safety margin. Okay, that percentage, how much have I assumed here? 10%. Suppose you got current asset minus current liability, how much? 20 lakh. How much safety margin we have to maintain? 10%. To whatever number you have got, multiply 10% to that. How much is that? 20 lakh ka 10%. How much? 2 lakh. That means your net working capital will be 22 lakh. Simply you need to add a safety margin. This is easy. This is how they will give in majority of the questions. Whatever number you have got, to that you add safety margin. Safety margin will always be 10% or question will mention. It can be 5, 10, 15, whatever. I have just for simplicity purpose taken it as 10%. This is the most common way of asking safety margin adjustment. There is one more. There is one more way. What? Pay attention to these words. Exactly call out this for me. Once again, read this for me. This 20 lakh is working capital excluding safety margin. Now when you add safety margin, now you will get what? Working capital including safety margin. The key word there is excluding and including. Okay, Naji? Now another way of asking safety margin is they will say same thing, maintain safety margin at 10%, but including safety margin they will say. Maintain working safety margin of how much? 10%. On what basis? Including basis. Now, normally we multiply safety margin of 10% on an including number or an excluding number. This 20 lakh is excluding safety margin. Take this and multiply 10%, correct? But in this question, what have they told? In my example, what they say? Don't calculate safety margin on the excluding number, calculate on the including number. That means now we have to calculate safety margin on this. But do you know this? No, adding these two only you will get this. Now that means this particular number is not known. So how will you calculate safety margin? This they used to ask in your foundation. Remember, profit after charging commission you used to calculate. You used to do rate divided by 100 plus rate in accounts. See a foundation. Similar wala adjustment over here. Okay, na? Everybody good? So what is the funda over here? We can't calculate safety margin on the 20 lakh. We have to calculate safety margin on the including number, which in my example is what? 22 lakh. Now how to calculate? Because we don't know this number. For that, multiple ways to do it. I've explained the logic of that in regular class. Now I'll tell you one formula. Much easier. Logic I'll have to spend 5 minutes. Formula 2 minutes. We'll take the time essence wala. Now if they give you, what scenario again people? Watch out. What is the word? You look for including. If they say that, let's say working capital excluding margin is still same number. How much is that? 20 lakh. But should you calculate safety margin on the excluding number or including number? Including number. Including number is available or not available? Not available. So how to calculate safety margin is very simple. Take working capital excluding safety margin. How much is that? 20 lakh. There we used to do rate divided by 100 plus rate. Rate divided by 100 plus rate. Here ulta. Rate divided by 100 minus rate. Rate divided by 100 minus rate. What is the rate of safety margin? 10%. So take this 20 lakh into rate. Rate is 10%. Divided by 100 minus rate. 100 minus 10% is how much? 90. That way you will get the answer. Fine, people. I'd explain the logic of this later. Now I'll not go into that. Follow this. This is rare, okay? You don't get this in too many questions. In one or two RTPs, MTPs, they've asked this particular adjustment. Otherwise, mostly it's going to be this adjustment that's going to come. Fine. You will do this method when? Only when they say calculate safety margin on an including basis. If you see the word including, then only you will do this. Otherwise, normal way. Done na, sir. Now tell me what is this once again. Just call it out for me. How do you calculate safety margin? Here in this case, take excluding wala number. Take excluding wala number into rate divided by 100 minus rate. Okay. Yes, sir, people. Why we don't, if you want to know why we don't add this, in CA Foundation we used to add, right? Because that was an expense. If you remember, we used to calculate managers' commissions and all on that basis. That was an expense. Expense we used to finally reduce from profit. Expense finally we used to reduce from profit. Safety margin we are reducing from number or finally adding. Hence, it has an opposite effect. Okay, there is another logic also. Let's not go into that now. This is enough for the time being. Because if you do this, you'll get marks. That's enough. Okay. That's your safety margin ka one more drama. Done? Okay. Now can I take you through one more question on the working capital estimate just to get our understanding little better? Can we try to solve a little faster? Okay. Show you the number, wait. Find in the question only stuff over here. Question number 23. Again, study material question. You remember I said one way of asking is based on time. Another way of asking is based on units. So we learn about the units bala proportionating in this particular problem. Too much cold, super. You're not able to hear, Okay. Question number 23. Anija Limited. Study material question again. Is a newly formed company. Newly formed company means no opening stock of WIP, no opening stock of raw material, no opening stock of finished goods. Okay. First time they're asking working capital, blah, blah. Okay. Sir, 1,04,000 completed units. Completed units means finished goods. 4,000 units of WIP. Awesome. Normally, WIP, we get it as a proportionate. But here we have to worry, or they've only given units. So take the units and multiply by the respective cost per unit. You'll directly get what here? WIP. Should we have to do proportionate or not required? In the previous problem, walk me through once again. How did you find WIP? Previous problem. First, raw material related WIP, how did you find? Annual raw material consumed divided by 12 into work in progress holding period multiplied by DOC. Why? Because number of work in progress units was given or missing. Hence, we use that wala proportionate. Here we have to use proportion or WIP units given. WIP units given how much? 4,000. And what is raw material cost per unit? 80. Simply if you multiply, you will get the raw material related to WIP. Yes, no? Here we don't have to do proportionate, directly multiplication. Comfortable? Okay. Now check. Raw material cost how much per unit? 80. Wages 30. Overheads is how much? 60. Including depre or excluding? Anyway, we solve the problem on a cash cost basis. So depreciation should be included or excluded only. We want excluded wala number and they have given excluded. So any more adjustment to be done or nothing? Take this only. Total cost they have given, selling price given. Okay. Raw material in stock, how much? 4 weeks consumption. So last problem data was given in months. Here it is given in weeks. So we'll have to do the proportionate in weeks. In a year, how many weeks are there? 52. Work in progress, assume 50% completion stage in respect of conversion cost. That any which way we will do the same. Raw material will assume 100%. Conversion cost we're going to assume 50%. Here any which way told. A material issued at the start of the processing. So full material if you issued at the start of the processing. DOC of raw material is 100%. Finished goods they have not given in time. They have given in units. Remember we discussed. So that means here we'll do time proportioning or units proportioning. Units. Credit given by supplier. Creditor gives 4 weeks credit. To debtors we give 8 weeks. Lag in payment of wages. Lag means paying on an early basis or a delay basis. So there's nothing but what? How many? 1.5 weeks. Okay. Cash to be maintained how much? 25,000. Anything else given? No. Safety margin also not given. I think you already know. Assume that how many weeks are there in a year they say? 52 weeks. Okay. And all the sales they're asking us to assume is on a credit basis. That any which way we're going to assume the same. Okay. Walk me through the process people. First working note. WIP. Proportion or straightforward? They have already given WIP units how much? 4,000. So how much is raw material relating to WIP? WIP ka units is 4,000. What is the raw material cost we saw? 80. Was it 80? Raw material cost is 80. So 4,000 into 80 you do. How much is that? 3,20,000. Next. And DOC is anyway 100%. So this is same. And what about labor cost? 4,000 units. So what is the labor cost per unit people? Wages is 30 and overhead cost is 60. Okay, 4,000 units of WIP, labor cost is 30 per unit. So don't multiply and leave it at that. Because if you just leave it at that, that means activity is complete. Right? Work in progress means it is fully complete or not fully complete? Not fully complete. Hence always don't forget to multiply DOC. For conversion cost, if they don't give, we'll take DOC to be 50%. Multiply how much? 60,000. Same thing for your overhead cost. What is the overhead cost per unit? 60. How much is WIP units? 4,000. 4,000 into 60 multiplied by DOC percentage, which is 50. 1,20,000. So you got your closing stock of WIP 5 lakh. I hope little better now. Working on number 2. Walk me through. First, raw material consume. Here once again people, they give finished goods data separately, WIP data separately. To produce finished goods also you will incur raw material. For WIP also you need raw material. Right now you need to buy, right? So hence what you have to do. In the previous problem it was combined. So we took. Here they have given combined or they have separated. How much of finished goods did you produce? They told 1,04,000. How much is WIP? 4,000. That means for 1,04,000 finished goods, how much material you need? For 1 unit, 80 rupees. For 1,04,000 units, how much? That is 1. Okay. This is for finished goods. Only for finished goods you need raw material or also WIP. So add WIP ka raw material we have already calculated. How much is that? 3,20,000. Take from the previous working note only. Add 3,20,000. That gives you total raw material consumed. Easy. Okay, Naji. Same way, your labor cost also. How many finished goods units? 1,04,000. For 1 unit, what is the finished goods? 30 rupees. So add. What about WIP related labor cost? How much is that? 60,000. Add it. Totally, you will get annual labor cost. Same way, overheads. How many units? 1,04,000. What is the overhead cost per unit? 60. Multiply, you will get the finished goods relating to overheads. What is WIP related to overheads? 1,20,000. Add it, you will get the value. Clear, Raji? Adding all this, you will get what? Factory cost. To this, add opening stock of WIP. It's a new company, they only told. For a new company, opening stock is 0. Minus closing stock of WIP, you already got. How much is that? 5 lakh. So by doing plus minus, you will get cost of production. Admin expense not given. Opening stock of finished goods not there. Reduce closing stock of finished goods. Here be careful. Closing stock of finished goods, you will use time proportion or units proportion. Time or units. Time or units. So check how have they given finished goods. They give finished goods ka stock in time or units. You calculate for me now. 8,000 units. Your cost of production is, you calculate, let's check the value. 1,76,80,000 is the cost of production. Obviously, you incur cost of production to produce finished goods. How much of finished goods? 1,04,000 units. So calculate. What is the number you're getting? 13 lakh. How did you calculate? 1,76,80,000 is the cost to produce 1,04,000 units. You have 1,04,000 units or 8,000 units. For 8,000 units, how much? 13,60,000. Easy. This is units wala proportion. One of the two adjustments will be given to you in exam. Okay, adding all this, you will get COGS. Selling expense not there. So same thing will become annual cash cost of sale. Have they told in the problem credit sale is 90% blah blah? No. That means cost of sale and annual cash cost of credit sale, same. Are you using this? Find debtors for me. How do you do? This is a number and debtors data they give in units or time. Debtors, creditor, usually they'll give it in time. But the time is in months or weeks. How much credit we give it to debtors? 8 weeks. 8 weeks. Okay, use this data and calculate for me. Let's see. 1,63,20,000 is for a whole year. That is for 52 weeks. How much for? 8 weeks. 25,10,769. Same number. That's your debtors ka value. Need a minute or okay? Working note number 3. What is it? Creditors. For creditors, we need annual raw material purchase. But they have given annual raw material consumed. From consumed, how do you go to purchase data? Take the consumed data, add closing stock of raw material, reduce opening stock. Opening stock is 0 because new company. How about closing stock of raw material? Have they given it in units or time? How have they given the data for raw material? Raw material they gave on a 4 weeks consumption. 4 weeks consumption. They have not given it in units. They have given it in time. So do the time proportionate. 4 weeks. So how much is your annual raw material consumed? 86,40,000. This 86,40,000 is for the whole year, as in 52 weeks. For 4 weeks, how much? 6,64,615. New company, so opening stock 0. Doing this plus minus, you will get annual raw material purchased. Find out creditor for me using this. What is creditor ka period? Creditor ka we give how many weeks? 4 weeks. So calculate that for me, people. Annual raw material purchased is 93,04,615. This data is for 52 weeks. For 4 weeks, how much? This number divided by 52 into 4 will give you 7,15,740. I hope better. Take all this data and dump it into your working capital estimate wala problem. So all the closing stock of 3 things you put it, debtors you update, prepaid expense not there, cash is already given. Creditors also we have, but don't forget the outstanding expense. Do we have anything outstanding here? Yeah, there is a lag in payment of wages. How many weeks? 1.5 weeks. Now people, we need total wages. So for that again, don't calculate. Our cost sheet will have that. What is the total labor cost? 31,80,000. 31,80,000 is the cost for 1 day or whole year? Whole year. Whole year is 52 weeks. How many weeks wages is lagging or outstanding? 1.5. So 31,80,000 is for 52 weeks. For 1.5 weeks, how much? 91,731. Safety margin, any drama? No drama. No drama. That's the answer. Better. So one type of question we are done. Can we move on to the next? Okay. This chapter alone, I will do the concept and immediately we'll do the question also backing that, because there are too many, we might forget it. And some of them are better learned with numbers. So, on this till here, I think we are there. We're done. Okay, moving on to the next two. Treasury management, all these are theory, people, not that important. Leave that. Now, one thing if I'll have to say is cash management model. 1 or 2 marks this may be asked either as a theory or as a small numerical. Quickly, I'll run you through that. Now we are moving on to cash management. First set of problem is estimation of working capital. Now we are moving on to managing cash. So now, one question arise was, how much cash should the company maintain? How much cash should the company maintain? 1 lakh, 10,000, 40,000, how much? That Baumol sir, William Baumol sir is trying to say how much cash or what is the ideal level of cash a company should maintain. You remember economic order quantity wala formula in costing? Square root of 2 AOC, 2 AO divided by C. Here UPS. Here what? UPS. Same square root 2 times of UP divided by S. Same economic order quantity means what? How much inventory order we should place so that the ordering cost and the storage cost is minimum. Correct? That's what economic order quantity is trying to calculate. Here also same thing. Baumol sir used that economic order quantity ka formula. Instead of AOC, sir substituted with UPS. Okay. What sir is trying to say is, people each time, see, when a company has a surplus cash, they will invest. When you invest, there will be a cost. Because when you invest, you will have to go through a broker. Broker may charge some brokerage. So each time you invest, there is a cost. If you don't invest, you lose out on the return. If you want to invest, you have to incur a cost like brokerage. If you don't invest, you will lose out on the return. So Baumol sir is trying to say how much cash you should maintain so that your transaction cost, your brokerage cost and your opportunity cost of losing out the return, both are minimum. Same economic order quantity wala formula. Instead of AOC, it is what, people? UPS. Data will be given. U for annual disbursement. Annual disbursement of cash. They will give you the value. P for transaction cost, like brokerage. 30 rupees per transaction, 50 rupees per transaction, they will give you. S is your investment return, or they will say opportunity cost of return is 8%, 10%, etc., etc. Take the number, plug it into the formula, you will get the particular number. Same EOQ ka formula. Instead of that, UPS. 1 marker question, if at all it comes. Most of the times it doesn't come, just covering. Okay, now people. This is about Baumol sir ka model. Baumol sir in a way is suggesting how much cash should the company maintain. Now there is same another sir, Miller or ORR model, Miller or model. What Miller or model is sir saying is Baumol model is faltu. Baumol model is faltu because an organization cannot have a minimum level of cash. Or let me rephrase that, every organization cannot have same level of cash. Like ArivuPro and Tata. If Tata is maintaining 1 crore cash in hand, Gandhi note, can we also maintain 1 crore Gandhi note? That much cash only we don't have, no. Yeah, no, yes. So do you think ArivuPro and Tata are comparable or not comparable at all? That means how can every organization maintain same level of cash balance? So that is not possible. Hence, Miller or model suggested something else. He did not suggest a number. He suggested a limit. Miller or model is not suggesting how much cash to be maintained. Miller or is giving a limit. Sir defined 3 limits: upper limit, lower limit, return point. Upper limit, lower limit, return point. Water ka chemical symbol, chemical formula H2O, HZO. Here H2O alla. And 2 and Z almost look similar only, no? Instead of H2O, it is, well, remember it as what? HZO. H is upper limit is denoted by the symbol H. Lower limit denoted by the symbol O. Return point denoted by the symbol Z. Okay. Now what is this? Look at this. William R. model defined the limits. Upper limit, lower limit, return point. Upper limit denoted by H. Lower limited by O or 0 also they can say. Okay. Return point is Z. Okay, now what Miller or model is trying to say is, let's say a particular organization, again, upper limit, lower limit, organization only should find every organization should find their own upper limit, their own lower limit. Let's say a particular organization ka upper limit is 50,000. Upper limit means maximum cash a company should hold. Maximum cash a company should hold. Lower limit means minimum cash a company should hold. Now what William Miller sir is saying is, the moment cash reaches upper limit and the return point is average number, let's say 30,000. Okay. What Miller sir is trying to say is, the moment cash reaches 50,000, that means we are holding too much cash. We are holding too much cash. When you are holding too much cash, invest. When you are holding too much cash, invest. How much money you will invest? Invest in such a way that you get back to return point. You get back to return point. From 50,000, your cash balance should become 30,000. How much you will invest? 20,000 you will invest. You will do the investment when the cash reaches upper limit. Now, when the cash balance reaches lower limit means you are holding high cash or very less cash. The moment cash reaches lower limit, which is 10,000, you already purchased the investment. Now sell the investment in such a way that cash balance again comes back to return point. How much investment you will sell? 20,000. Like this. So you keep playing around this number. So as long as you are within this range, you are fine. And this range, is there any magic number or organization should find for themselves? Each organization should find their own limit and within the limits play around. Accordingly, you decide when to invest, when to sell the investment. That is a Miller R model ka funda. Theory may come, 1 or 2 points you may have to ask. I only told over here upper limit, lower limit is there, no? 1 point, that only. When cash reaches upper limit, purchase the investment to get the cash back to return point. When the cash reaches lower limit, sell the investment to make the cash balance reach back to return point. Ho gaya 3 points, enough. 2 marks they'll ask you at best. 2-3 points if you remember, more than enough. Okay now people, again not that very popular also. This is okay. Yes sir. No. Investment is not sufficient means? We'll take a loan. I'll talk about in budgeting. In that one problem I'll take it. Float means delay. Again, this is okay. Leave. The word float in FM means delay. Okay. So we have done one question on float. I think here I would not like to take you through that for the time being. Next, what we can do? 1 minute. Give me 1 minute. Go 1 minute. 1 minute. Or maybe we'll do off cash cycle. Hang on. One question was there on cash cycle. We'll do off that. On this one. Question number 11. Question number 11. It's a study material question again. If you don't have the question, no problem. Simple question. Go look at the screen. Following information is available with respect to Sai Sir Trading Company. On an average, debtors are collected after 45 days. Inventories holding period is 75 days. Creditor payment period is 30 days. Sir, if you are a trader, you'll have raw material and work in progress. Huh? No, you'll only have finished goods. Okay. Firm spends 120 lakh annually at a constant rate. It can earn 10% on investment. Whatever investment they make, they earn a return of 10%. From the above information, you are required to calculate cash cycle and cash turnover. Sir, cash cycle, operating cycle, one and the same. Tell me what is the operating cycle ka formula? R plus W plus F plus D minus C. Same for cash cycle. Is R there? No. Take a calculator. R is 0. It's a trading company. So raw material work in progress is 0. What about finished goods ka? Here inventory refers to finished goods. What is finished goods ka storage period? 75 days. Plus debtor ka credit period. 45 days. Minus creditor ka payment period. 30 days. How much is your cash cycle? 90 days. That's your first requirement. Easy. So if your cash cycle is 90 days, what is the meaning? Your funds are getting blocked for 90 days. That's the first requirement. Then they asked what? In the same requirement, they also asked cash turnover. Cash turnover means how many cycles can you run in a year? How many cycles can you run in a year? Some problems they will ask us to assume 360 days. Check, have they told? Assume how many days in a year? 360. If they don't mention anything, we'll take 365. Here specifically they ask us to told 360 days. Now people check. To run the cycle once, how many days we need? 90 days. And in a year, how many days are there? 360 days. So this particular cycle, how many times you can run in 1 year? To run one cycle, 90 days. And there are 360 days in a year. So 4 cycle. Tell me the formula for that then. You took 360 divided by 90. So formula will be number of days in a year divided by cash cycle. So basically 360 divided by 90, your cash turnover is 4 times. Clear, people? Okay. Next, what have they asked to? A minimum amount of cash to be maintained as they become due. 1 minute, people. How much is the company spending annually, they told? What is your annual operating cost? 120 lakh. This is for 1 day or annually? Annually. 120 lakh you are spending on an annual basis. Okay. Now, in a year, how many cycles can you run? In a year, you can run 4 cycles. And how much are you spending annually? 120 lakh. This 120 lakh is annual number. This 4 is also annual number. That means, can I say 120 lakh is the money required for 4 cycles? For 1 cycle, how much money? For 1 cycle, how much money on an average you need? 30 lakh. Tell me what is that as a formula? 120 lakh is annual operating cost divided by number of operating cycles in a year. That only we are calling it as cash turnover here. So the formula will be annual operating cost divided by cash turnover. So you are spending 120 lakhs in a year to run 4 cycles. For 1 cycle, to run 1 cycle, on an average, how much balance we need to maintain? 30 lakh rupees cash balance you need to maintain to complete one particular cycle. Problem, got it? Got it. Next, same they've asked now. 1 minute, where is it saying? Savings, they're asking you to calculate savings by reducing inventory holding period by 30 days. What is your inventory holding period? 75. Is it 75 anymore or it is reducing? Watch out, people. Sometimes they use the word to. Sometimes they use the word by. It is reduced to 30 days means 30 days only is inventory period. Here it is 2 na by. It is reduced by 30 days. So from 75, it will reduce by 30 means what is the new period? 45 days. Now you have to calculate. Again, calculate the cash cycle for me. Inventory holding period now is 75 minus 30. How much? 45. Debtor is still 45 minus creditor 30. How much is that? Now your cash cycle will be 60. Calculate cash turnover for me. To run 1 cycle, we need 60 days. To run 1 cycle, we need 60 days. How many days are there in a year? 360 days. So how many times can you run the cycle? 6 times. That's your cash turnover. Okay, Naji. Next, how much minimum cash we have to maintain now? Annually, how much are you spending? 120 lakh. 120 lakh is for one cycle or six cycle? 6 cycle. For one cycle, how much? 120 lakh divided by 6, how much? 20 lakh. Sir, earlier, how much minimum cash balance you used to maintain? 30 lakh. Now you are maintaining? That means your cash balance is same or it is getting reduced? That is a savings. That is a savings. We can stop the answer there, but if they had not given one more data, I would have simply said savings is 10 lakh. But they told in the problem, sir, when you have extra money, when we have extra cash, now here, earlier we used to have how much minimum cash we had to maintain? 30 lakh. Now are we maintaining 30 or 20 lakh? That means how much cash we don't need anymore? 10 lakh. That means can I say this is surplus cash? If somebody has surplus cash, they'll keep it idle or invest. Do you know investment ka return? Yeah, they told investment ka return is how much? 10%. That is your savings amount. So how much cash is available for investment now? Earlier you used to have 30, now cash needed is only 20. So how much cash has got released? 10 lakh. That you can invest and get how much return? 10%. So how much is your savings? 1 lakh. If this 10% was not given in the problem, I would have said savings itself is 10 lakh. Because they gave 10% return, we are calculating the return amount and calling it as a savings. That's all is this problem. Clear, people? This is about cash management. So basically, we have to manage each components of current assets. Inventory management, you learn only in costing. It is not there in FM. Cash management, we covered. Oh, I think there is one more. Budget. We'll do of that also. Any problem? No. Okay. Now, I'll just go back to the chart once. So, where it is there? Here. Now, people, another type of question which can come for anywhere between 6 to 10 marks is the cash budget. It's come, it can come. Budget, in fact, is very easy, but it is very lengthy. Probably the lengthiest of all the type of question we have here. Very easy. It will take a lot of time, but more importantly, what will happen is when you're solving budget problem, lot of silly mistakes will happen. Because there will not be one column. There will be like 6-7 columns. Hurry burry mein, instead of updating in column number 2, we'll put the value in column number 3. These sort of small mistakes happens a lot in budget problems. So watch out for that and watch out for the time. Okay, budget will be on the little lengthier side. Conceptually very easy. Now, budgeting means what, people? Budget in general means what? Estimating the data which has already happened or the data which is about to happen. Something which is about to happen, we are predicting. Like election polls. Correct. Okay. Now, budgeting means we are predicting the future. We are predicting the future. There are few ways to prepare the budget. One is receipts and payment method. One is the receipts and payments method. In this method, all the receipts we have to estimate, all the payments we need to estimate. That is one. Another way of budgeting problem is adjusted income method. Adjusted income method means from profit, we'll try to get the cash. From profit, we'll try to derive the cash balance. That's what we used to do it in AS3 cash flow statement, if you remember. Indirect method. From profit, we used to derive operating cash flow, if you remember. This is that method, adjusted income method. This is not there in your syllabus, only theory is there. I'm just saying. Okay. Last one is balance sheet method. Sir, in balance sheet, you'll have assets, liabilities. Now, what balance sheet method says is, you find out all components of balance sheet. You find all components of balance sheet like equity, share capital, retained earnings, long-term debt to current liability, fixed asset, current asset also, except cash. Get cash as a balancing figure. Get cash as a balancing figure. All the other components of balance sheet you calculate and get what as a balancing figure? Cash. That is your adjusted balance sheet method. These two we will not apply in our problem. In exam, what they will test is the receipts and payments method. Okay. How this works, let's take up through one question and probably understand that better. Where is it? Question number 25, zeta, again a study material question. This is a good question to know the concepts. So I picked up this. You're finding, okay, fine. All of you are voting places here only, or you're supposed to travel today? You're supposed to travel overnight journey, huh? Or after class? After class. How far you say, macha? 2 hours. 2 hours is manageable. On election day and all, you have some travel problems, huh? Buses and all are restricted, is it? Anything of that sort? No? I'm asking because can I reach Bangalore? I can reach, no? No, just kidding. Anyway, I booked my tickets. I'm just asking. Yeah. All right. All of you are voting, right? All of you are eligible to vote, right? First. Anybody not eligible to vote? All of you are eligible to vote. Whom you are voting, you don't have to tell. I don't want to know that. And just asking. What? That's good. But I've heard that here, like, I think some few of them were telling. I think even Dilip sir in Bangalore was telling. Some of the audience in Tamil Nadu are attending classes there. They were saying, finish the class early, 1 or 2 days early. We want to go to our hometown. Is it a normal practice that 1 or 2 days before election only you guys want to go to your hometown and do some campaign or something? Is it? Yeah. And like, normally, what do we do is on the election day, we will check. Early morning, we'll go and vote and come off. Where the crowd is the very less so. Otherwise, after 10 o'clock, the crowd will become, I think these days it's manageable. They have a lot of booths, and I think overall, I think it should not take more than 10 minutes, 15 minutes. But still, people are lazy to wait for that also. We'll be like, go, tuck, pee, come out. Yeah, we want that wala feeler. Yeah, so, but is it a normal practice? Just was curious. You're like 1 or 2 days before only you would like to prepare yourself for election? Huh? He's saying they will get some benefits. Now I can't tell all that on camera. Ignore that, people. Okay, he said that, I ignored it. You also ignore it, not me. Yeah. Okay. And that is a different thing. So I think we should not speak about that at all. That I think pretty much happens everywhere. Okay. All right. Fair enough. So that means tomorrow holiday for you, indirectly. But Papa, you have to prepare also, no? I think your now mind is not running on the election side. Your mind is more about CA. What is the final date of what is the last date this time? 15th. So it starts on 5th and it ends on 15th. So that is the day you are eagerly waiting for. On the 15th day, literally books, freedom, right? That all a feeling, right? Yeah, I can understand. Even we used to have the same feeling. Finally, that I think ours used to be afternoon exam. Now also I think it's same afternoon. At 5 o'clock sharp. Jai Allah Jesus Shiva. The paper goes well, no? Amazing feeling. Yeah, throw everything. One day, I think next to 2-3 days, do nothing. Only we'll not get that much sleep. But still, we'll be like, we'll roll on the bed only like a potato. Because so many days we would have compromised on our sleep, no? Yeah, so I think all that we want to compensate in the next 2-3 days. But thuko varadili. Yeah, we will say that's all. Sleep will be still 7-8 hours only. Beyond that, difficult only. Unless you people are Kumbhakarna, where you can sleep for whole day. Okay. Now, what the?
After exam, thinking about result.
After exam, you're saying, I'll think about result. Don't think much. Enjoy it. Go for All India Darshan. Yeah. Just hop on one train and go for All India Darshan. Best. That's what they say. In fact, many people say that. If you want to really get confidence in life, right? In India, no, you don't have to do much. Many people say this. Just go and do a train travel. Or public mode of transport while travel. Not fancy. Not flights. Right? Not your too much of AC 2-tier and AC 1-tier travels. A normal travel when you do, you'll meet different sets of people. You'll get to know a lot of stories. And that inspires. Because most of us have that, we will think our problems only is great. We are going through so much. What do you know? We are studying 14 hours a day. Somebody is working for 20 hours a day. Manual labor. Okay. So then we'll think, I am okay. Manageable, right? So they say at least 6 months. Many people have suggested this. 4 to 6 months if you travel in India, all across India, length and breadth, north, south, east, west, right? No particular course can teach you that much knowledge as the 6 months travel teaches, it seems. I've not experienced. I've not done continuous travels. Of course, I've traveled in bits and pieces, like 20, 25 days, 30, 35 days of that sort, but not done it in one shot. But if given a chance, especially, I would say, I think it's worth. I'm not pushing you, just saying, okay, it's your call what you want to do. But definitely it's a big confidence booster, because you need to be comfortable with the meeting with the people, interacting with the people, and putting across your points. Most of us are chartered accountants. No, we are good. We are amazing here. Super knowledge, right? But not so good. Expression does not mean English. We don't have to be Shashi Tharoors of our country. Right? Just that confidence of putting across your thoughts. That should be there. Most of us hesitate. We have that stage fear. We feel like what people will think, what they will judge. Strangers and all we will worry. We would have not met them only. What will he think? First of all, who's he? Do you know him? Her? No, then why are you bothered? That person is not putting sore on your plate, no. Sapad, is he putting? No, right. So that means you should worry about your things. So confidence is important in people, in life in general. Land a degree. Degree is secondary. Yes, we are in this particular journey. We want to complete it. Definitely so. But degree without confidence will not get you far. So just blindly don't be restricted yourself to the four walls of the classroom. That was a mistake which I did initially. Right? I was too good in studies. I'll not deny, not even boasting. I was always the first ranker, second ranker types throughout. Right? But what I lacked immensely was that self-belief or self-confidence in interacting with people. If 10 people look at the sky and say it is pink color, I used to say, pink only. It is not blue. That much scared I was. Right? Yeah, it was. Trust me. Right? I have gone through so much, like, in fact, so much of stage fear I had that the moment I used to look at people, I'd be like, this, right? But then, yes, I went through a few embarrassing moments. So yes, I had my share of a lot of embarrassments in life, but that's how you learn. You'll have to put yourself, go out of that comfort zone, put yourself out of that comfort zone, and then only you'll learn. And now, if I am sitting here and addressing here, the reason is because I took that chance. The reason because of that shivering, because that day I shivered, now I'm able to face you with confidence. So you'll have to put you through. Don't be afraid of trying new things in life, and don't be afraid of people mocking you. If someone is laughing at you, don't look at it like people are laughing at you. Look at it like people are laughing because of you. I mean, you are an artist. You're making them laugh. Such a nice job, no? So change your perception. Don't be worried about what someone thinks. Doesn't matter who it is. Many times our relatives only will be will pull us down. Right? Yeah, because jealousy is something which is a big part of human life. Because from our schooling days, we've been taught you have to be 1 mark ahead of that person. He's your good friend only, but I still need to be 1 mark ahead. So our constant thing is I want to be little ahead of somebody. So when you're constantly thinking on those directions, right, we'll become too much competitive and jealousy might creep in. But focus on things that you can do. Not worry too much about what somebody else is doing. Because that's a bad feeling to have. Thinking about what somebody does. Right? Because it's a constant pressure. See, now also, like I'm telling you even now, like I've qualified almost like 15 years back. Still, if I have to really compare, there are so many teachers like who work for like 12 hours a day, who do non-stop marathon for 12 hours a day. Now, if I think he's doing 12 hours a day marathon, he also should do, then my throat will give up. And then that will probably be my last marathon, which I don't want. I'll only do what I can. Like in our own academy, many teachers like your Akhilesh sir, or Karthik sir, they or Dilip sir, they all take morning evening batch. But my body doesn't support morning evening. I tried. I've tried 8-9 hours, but I used to work in the initial 4-5 years. Now I feel very tired. Right? Maybe old, daddy did it. Yeah. So it doesn't support. Now I feel like I don't want to do. That's not me. If they want to take more than happy, let them do. That's their journey. This is my journey. So we can't, because if you compare, comparison is always there in every field and everything. So just focus on what you can do. Now, right now, you have to study. Just focus on your studies. How many times your revision your friend has done and all, you ask after the exam. It's fine. Now, purely what needs to be done. Correct, no, macha? Yeah, they all met their friends and came. Now this guy started putting blade. We'll go and come now. Yeah, no, over macha. Blade, not too much time. Already 9. Okay, we'll come back. Apologies for that. Recorded people, don't worry. Now, question number 25. End of the day, try out new things in life. Go out of your comfort zone. Whether it is your studies, life in general, if you want to try out something, a business idea, a travel, could be whatever. Could be as simple as, right, changing your sleep timing, could be changing your eating timings, whatever. If you're not a morning person, if you're a person who wakes up at 9 o'clock in every day, try waking up maybe 7 o'clock one day. Small habits can build a big momentum in your life. So focus on that, and every opportunity when you get to address someone, take up that opportunity. Initially, it will be like this, but that is required for you to achieve. If you want to earn big money, big fame, speaking is a good skill, people. Holding audience attention is the biggest currency in today's environment, because we are Instagram zamana. Beyond 10 seconds, people don't have patience beyond 1 or 2 minutes these days, right? So if you can hold someone's attention for 1 hour, 2 hours, 3 hours, 4 hours, it's a good profession to be in. So work on that. It'll take some time. So just don't be focused only on the degree. That's not going to get you. It's going to get you a job. If you're a rank holder, definitely you're going to get an amazing opening job. But will you survive in this field? Depends on your upskilling portion, your networking, your communication skill, your confidence. More importantly, self-belief. Start practicing that. Don't ever talk negative to yourself. Can I do it? I am already 4 attempts over. I am an average student. Doesn't matter. Now it's a restart. This is a fresh start. So always look at it like that. Everyone can do it. If a dumb guy like me can crack CA, you Umma people, you are brilliant, folks. You will do it like this. Aram se you will do it. Okay, now have that confidence, have that belief. It's not required for anyone else to believe. We should believe in ourselves. That is enough. That we will tackle the whole world. You remember that Rajinikanth 1 rupee coin, no? 1 rupee sir built 1,000 crore empire. Yes, no. Like that we will build the same. Shivaji movie, correct. Okay, but end of the day, have that self-belief. That's all I would say. Now come back. I think enough for now. Maybe after some time we will take up the extra blades. Question number 25. This is the question number 25 in our class notes, a study material question. Following information relates to Zeta Limited. By the way, people, which question are we solving? Which question is it related to? Cash budget. So one company, it's a publishing company, Zeta. They've given data. Selling prices 15 per book. Sales are made on credito and invoice on the last day of the month. Fair enough. Variable cost of production per book is material cost. So we are a publishing company. We will publish the book or produce the book and then sell it. To produce the book, how much material cost will incur? 5. Labor cost is 4 per book. Overhead cost is 2. So add all this and deduct 15. Probably you'll get your profit. Okay. Sales manager has forecasted the following volume. Sale manager will estimate production volume or sales volume. Obviously, sales manager will give you sales units. So this is the number of books sold or expected to be sold from November till August they've given. Fair enough. So if you take the number of books and multiply by the selling price per book, you will get the sale value. Okay, G. Customers are expected to pay. They already told, no, we make the sale on a cash basis or credit basis. Credit basis. Now customers are expected to pay 1 month after sale. How much? 40%. 2 months after sale, 60%. So customers are paying in 1 installment or 2 installment. People, we are preparing cash budget on a receipt and payment basis. Receipt and payment andre, each receipt we have to forecast, each payment we have to forecast. Now collections from debtor is a payment or receipt. So one working note, we'll put it up for this now. Now when they give you big budget, data will be quite lengthy. Okay. So first read the requirement for what is your budget period. You need to prepare budget for what to what. Prepare a cash budget for 6 months from January to June. Jan to June. So but they have given Jan to June data or November to August. But we need only from Jan to June. Fine. But if you make a sale in November, will you get the money in November only or 2 months after sale? 2 months after sale. Correct. So hence, you need to, just because they've given Jan to June as a budget period, should we take only budget period or before that also? Because November month if you sell means 2 months later in January also you will collect some money. Or if you don't want all that drama, one simple way is they've started from what? November. Our working note also will start from November. So that way we don't have to worry about period only. So first copy this. From November to maybe since budget period stops when? June. We can stop from November to June. We can copy the data. Here, check if that's what I've done. November to, in fact, I've copied till August also. Maybe if you want, you can stop at June in exam I'm saying. Okay, sir. Now, you tell me, I need units sold or I need sale value. How do you get sale value, people? Take the number of units sold and multiply by the selling price per unit. One or two we'll quickly do. 1000 into 15, how much? This 1000 into 15 is also 15. So, November, December, January, the sale value is 15,000. That is what I've got this. Easy. This is the sales made. In November, mein, how much sales have you made? 15,000. If you sell the goods means will we get the money immediately or 2 installments? 1 month after sale we will collect 40%. 2 months after sale we will collect 60%. That's what the question says. So November May if you sell means 40% of the money you will collect it in next month, which is what? December. 15,000 ka 40%, how much? 6,000. And November May 15,000 if you sell means 2 months later you will collect 60%. Calculate 60% of 15, 9,000. That is this number. Clear? Huh? These are the two collections for this number. Same way, December May if you sell 15 means January May you will collect 40% of that. How much is that? 16,000. Next month May you will collect 9,000. March May if you sell 22,500. How much you will collect in April? 40%. Calculate. 22,500 ka 40%. How much? 9,000. Balance 60% you will collect it in March. So on and so forth. That's how. I'm just showing you the pattern. Balance you can figure it out now. Now if you add it, you will get the total month ka collection. Now I have not total November, December and July and August. Why? We can find the value. Still not written. Why? Because our budget period is only Jan to June. Only budget period ka total I have done. This is payment or receipt. Receipt. One data. Clear, sir? Like this, we need to figure out each receipt and each payment. Very easy, but it will take a lot of time because so much of data to fill it in. Now check this about sales. Now we are purchasing the book and selling or we are producing? Producing. Now check. Company produces the books 2 months before they are sold. 2 months before they are sold. Now, March, May, if you want to sell 1,500 books means you will produce in March month or 2 months before? 2 months before. That means January only May you will produce 1,500 books. Correct? Huh? Similarly, January May if you want to sell 1,000 books means you have to produce this 1,000 books 2 months before only, which is what? November. That's the order. Correct? Huh? Alright. Now people have started from November. They have given the data from what? November. So now we will, or maybe I'll read this one more line. Creditor for material are paid 2 months after production. So we will produce the books 2 months before sale. But to produce the books, we need to buy raw material. So to our creditor, are we paying in that month only or 2 months later? 2 months later. So first let's get the few things right. Now, January, May, if you want to sell 1,000 books, how much this 1,000 books you should produce when? By November only. That means I will start copying the data from here to here. Do you agree? Give me the table ka breakup. Table ka heading is what? Payment to creditors. Payment to creditors. I will start. Month will start from November. November mein how many books I will produce? 1,000. That means I will start copying the data here. From here. Yes, sir. So that's what I've done here. Check. 1,000, 1,250 I've copied. Till June I've copied. Beyond June I don't need. I've stopped it there. Once more. Pakka. Pakka. Okay, now this is your units produced for that particular month. Now, excuse me, for to produce the books, how much will your material? Each book will cost how much? What is the material cost? 5 rupees. This is the books produced. This is the books produced. Now, and to produce 1 unit of book, how much material cost will be incurred? 5 rupees. So that means for 1 unit, 5 rupees means for 1,000 units, how much? 1,000 into 5, which is 5,000. So basically, take this and multiply by 5. You will get the total material cost needed to produce the books. Agreed? Yes, sir. This amount will be paid to the creditor immediately or 2 months later. This November month ka material amount or purchase amount, we will settle it now or 2 months later. January. That is what? Jan. This 5,000 you will settle in January. This December ka material cost of 6250, we will settle 2 months later, which is February. Like that, you will get the amount. This is receipt of payment. Payment to whom? Creditors for supplying the materials. Good, Asarji? And that's it. Is there or 2 more is there? labor and overheads. Can we read the labor and overhead part? So, and now what is the labor cost per book? For one book, how much is the labor cost you'll incur? 4 rupees. Sir, labor cost also you'll incur when you produce. Labor cost also you'll incur when you produce. Each month ka books produce data missing or already found? Already found. You already wrote here, no? Every month from November to December, November to June, how many books you will produce? This same data you will copy for your variable overheads and your labor overhead also, because both will come when you produce the books. Correct, Aji? Pakka na ji? Since I have written variable overheads here, first maybe I'll read that data. Check. What is the variable overhead per book, sir? 2 rupees. But hang on, read the information. Variable overheads are paid in the month following production. That means variable overhead expense you may incur in November. November month if you incur variable overheads, that month only you will settle, or next month? Because they said following production. So next month you will settle. And they are expected to increase by 25% in April. That means from November to March, variable overhead cost will be, per book will be 2 rupees. From April onwards, will it be 2 rupees or it will increase by 25%? So 2 plus 25%, how much? 2.5. From which months onwards? From April to August, the book cost will not be, overhead cost will not be 2 rupees, it will be 2.5 rupees. Question telling. Correct, sir? So let's get this done. How much books are you producing every month? Is that data missing or already got? For creditors only, we have derived that. So copy that. This is number of books produced. We want overhead cost. What is the overhead cost per book? Up till March, how much is it? Or up till March or up till April? What did they say? It will increase by 25% in April, they said. So from April it will increase. That means up to March it was 2 rupees. Okay. So this is the number of books produced. No? And what is the variable overhead per book? 2 rupees. So take the number of books and multiply 2. Up till which month? March. But from April onwards, you will multiply 2 rupees or 2.5 rupees. So for November, the cost will be 1000 into 2, which is how much? 2000. 1 or 2 I will show. Okay, no? For February, how many books have you produced? 2000. What is the cost per book? 2 rupees. 2000 into 2, how much is that? 4000. But from April onwards, will you take 2200 and multiply by 2 or 2.5? 2.5. So 2200 into 2.5, how much? 5500. Like this. Correct. This is the cost. This is the cost. Are we settling this overhead cost in that month only or following production? Following production means next month. So November month ka variable overhead, we will settle it in December. But is our budget period December or January? Hence only I have taken the data from Jan to June. If you want, you can write this also. December mein how much we will settle? November ka 2000 you will settle it in December. But not required for budget. Hence I have kept it as dash. December ka variable overhead you will settle it 1 month later, that is Jan. February ka you will settle it in March. April ka you will settle it in May. Like this you will get how much payment you will make from January to June. This is for what payment? Variable overheads. One working. That's it, or one more? One more. What is that? Labor cost. Labor cost also will come only when you produce the books. And how much books you are producing every month? Missing a same data. Here what you have copied. For creditor, variable overhead and labor cost. Number of books produced data is same. Now let's go ahead and check the labor overheads ka data. What did they say? How much is the normal labor cost they have given up? The initial May 4. Now they have given some adjustment. Check. 75% of the wages are paid in the month of production only. Following production in the month of production. That month only you will pay how much? 75%. Balance 25% when you will pay? And the balance 25% you will pay following month. So that means here wages are settled in 1 installment or 2 installments. That month only 75%. Next month 25%. And what is your labor cost? 4. Will it be same? No. Check here what they said. A wage increase of 12.5% will happen from 1st March. So from 1st March onwards, will it be 4 rupees or 4 plus 12.5%? How much is this? 4.5. From which month onwards? March month onwards. Clear, sir? Done. Now, how many, same drama. How many books did you produce in November? 1000. Per one book, how much is the labor cost? Up till February, labor cost is 4 rupees. From March onwards, it will become 4.5. So for 1 unit, 4 rupees. For 1000 books, how much? 1000 into 4, which is 4000. Similarly, January, 1500 books you produce. For one book, how much is the labor cost? 4 rupees. So 1500, 6000. Like this, you will do it up till February. From March onwards, will you multiply 4 or 4.5? So 1900 into 4.5, 8550. That you will go on multiplying for the remaining. Done now. This is what payment or labor cost. Labor cost. But we are preparing cash budget, means we don't want labor cost. We want labor cost paid. Right? How is the payment terms? 75% you will pay that month only. 25% you will pay next month. Okay, now check. Labor cost in November is 4000, means how much you will pay in November? That month ka 75%. 4000 ka 75% how much? 3000. 4000 ka 25% you will pay next month. Similarly, December it is 5000, means that month only how much? 75%. 5000 ka 75% is 3750. Next month 1250. Like this, you'll have to do the payment pattern. Should I have to take you through everything or okay? Adding these two, you will get the total payment. Total payment I have only captured from Jan to June because our budget period is Jan to June. Like this. So by the time you do this, all this you'll have to do it within 20 minutes. That's the crux. Very easy but lengthy. Because it will be 10 marks, maximum 25 minutes, not beyond that. So you'll have to be having good writing speed over here. And done. Now all these are working notes. Next, what they ask? Cash budget. From what to what? January to June. Budget ka same format we used to do in our regular class. Very simple. You start with opening balance, add all the receipts, deduct all the payment, and then you'll get the closing balance. As simple as that. All the receipts in one place, all the payments in one place. Okay. Opening balance. Check. They must have given. We are preparing budget from what day? 1st January to 30th June. They have given already cash balance. Check. On 31st December 20x3, cash balance was how much? 1500. We are preparing budget from 1st January 20x4. So 31st December 20x3 ka closing balance will become 1st January ka opening balance. How much is opening balance given? 1500. Start with that. Okay, sir. Add the receipts. Here only one receipt was there, which was what? Receipt from data. Sometimes cash sale also may be there. By the way, we read the whole data, na? Or anything was missing? Nothing, right? Okay, so few more are there. Maybe this part I'll read that later. Maybe leave. Now first we'll capture whatever we have so far worked out. Opening balance 1500. Add all the receipt. What receipt have you identified? Collections from data. It is there over here. No? Plug this number here. Collections from data. Clear, sir? Done. Then what have you identified? 3 payments. What are the 3 payments? Creditor payment, overhead payment, labor payment. All the 3 payments which you got from working note number 2, 3, 4 updated here. In budget, mein inflow we show it as a positive number, outflow we show it as a negative number. Done, sir? Now read some other extra data they've given over here. Company is going through some restructuring and they will sell one property in May for how much value? 25,000. So when they sell means it becomes a payment or a receipt? Receipt every month or May? So May month mein 25,000 receipt captured. Okay, that's it or few more. Then they told it is also planning to buy a new printing press in May for 10,000. When you buy, it's a receipt or a payment? Payment. Depreciation they have given. They can give depreciation 101 lines. I will not even read. Why? Non-cash. I'm preparing cash budget. Depreciation relevant for me or absolutely irrelevant? Irrelevant. They can say depreciation is this, so it became that story they can give. Not even bother. That is irrelevant for me. But printing press you purchased in May for how much? 10,000. Receipt or payment? Payment to which month? May month mein purchase of printing press so 10,000 ka outflow. Anything else? And there is also some tax payment of 10,000 when? March. So tax mein one more March month mein tax payment of 10,000 is there. Okay, people. From opening balance, add all the receipts and deduct. Take this one of you do this for me. There's one more extra point they can bring in the budget. It's not there over here. I will use this question and explain that. Take your calculator. Add all the receipt for me. How much is the receipt? Total receipt is how much? No, matlab only receipt. Only 15,000 here. And this month only 15,000. Okay. Now, similarly, add all the payments for me. Only for 1 month you add. Total payment. Only for the first month. From here to here you add and tell me how much. 30? 13 or 30? 13250. Pakka na? All right. Let this be on hold. So how you normally do the cash budget wala problem is opening balance, add all the receipts, deduct all the payments. Fine. Automatically you'll get what? Closing balance. Closing balance here is 3250. Easy. January ka closing balance will become February ka opening balance. Again the same thing. Take opening balance, add all the receipts, deduct all the payments, you'll get closing. And accordingly go on filling it up. Fine. This is a normal way. Problem ends here. Clear? In some problems, this is over. This problem is over. Another adjustment they can ask in budget. I don't want to go through one more problem for that. Here only I'll explain. One more way they can ask budget is, they will say company should maintain a minimum balance. Let's say, here I've just solved it for you. Company should maintain a minimum balance of 2000. They will say company should maintain a minimum cash balance of 2000. Now check everybody here. Same. How much is opening balance? Take a calculator. Opening balance how much? 1500. How much is your receipt ka total? 15,000. Add. How much is your payment ka total? 13250 minus. That's what I've done here. Opening balance 1500, receipt is 15,000, payment is 13250. How much are you getting? 3250. 3250. That is the cash available. But company wants to maintain 3250 or only 2000? Only 2000. We have 3250, but we need to maintain only 2000. So we have surplus. How much extra we have? 1250 we have extra. 3250 minus required closing balance of 2000. If you do, you'll get a surplus of 1250. If you have surplus money, then you will invest. You will invest. This is not asked in this problem. It may come. If they ask us to maintain minimum closing balance, then one more extra component will come as investment. Here investment sold or investment purchased. Since we have extra money, we will buy the investment. How much value? 1250. When you buy the investment, cash balance same or cash balance will reduce? It will reduce by how much? 1250 and closing cash balance will become 2000. Agreed. Everybody. January ka closing will become February ka opening. Now same drama. February ka also give me total of receipt. Only one receipt is there, which is what? 15,000. So I've added. Opening balance 2000. Receipt to 15,000. Yes, sir, people. Add all the payments for me. February month ka add all the payments from here to here. Add 6250, 3000 and 7500. If you add, how much are you getting? 16,750. Opening balance, January ka closing balance will become February ka opening. Receipt for February is 15. Payment is how much? 16,750. Do this plus minus. What are you getting? You're getting 250 rupees. Ayyo. We are only how much? 250. But minimum cash balance to be maintained? 2000. Yes, we have 250, but closing balance should be 2000. Now we have surplus or shortage? How much shortage? 1750. Last month there was surplus, no? What did you do? You purchased investment. How much investment? Now sell that. Because we have shortage now. No? When you have shortage, sell. When you sell investment, how much investment we have? 1250. When you sell investment, it becomes a payment or a receipt. Add 1250. Still is there, still shortage is there. Still how much shortage? Still shortage is there means borrow the money. Both they will not test. Ideally, how they will, it has come like this. So both they will not test. How either they will say is, 1 month it will be surplus. Next month it will be shortage. When you have surplus, you will buy the investment. When you have shortage, you will sell the investment. Both will not come. Borrowing, investment, both generally they don't ask. Investment purchased, investment sold. Each one they will go on alternative. Correct? Sir, first month only if you have shortage means, then you will take the borrowing. That is another kind of. First month only if you have shortage means you will borrow the money. Next month if you get a surplus, you will not invest. You will repay the borrowing. That's hence I have brought in everything over here. Either they will ask you these two scenarios in exam, or they will ask you borrowings taken, borrowings repaid. Both will not come. If it comes also, what would I have shown? Okay, this is another adjustment which can be asked in the budget. Normally, if the problem is way too big, this adjustment, ICA will remove it. But if they give you simple adjustment of budget, then this adjustment also can be inserted in the budget question. It depends. But I hope you're comfortable with this. Okay, so I think with this cash management fully we are done. Here, no? So if this minimum cash balance they say means, in the receipt column, if you want, you can keep the receipt payment as it is. End May, you can write investment. You can have two extra column: investment purchased and investment sold. Or investment sold you can show under receipt column. Investment purchased you can show under payment column. Presentation is your column, your choice. Two extra components will come: investment purchased, investment sold. Or borrowings taken, borrowings repaid. Show them as a separate two categories at the end, or show them under respective receipts and payment. That is also okay. It will definitely come. This value what we are showing will come into your budget. ICMA, we have such questions. We have done. Okay, you can refer to that. Okay. Cash over. How much more is pending? Cash over, debtor, creditor pending is there. Okay, now I think we'll do off first maybe credit debtor. Debtor is the biggest one. People, one more hour still is there. You don't do ussu pussu one. This one. In debtors, there could be two types of question. 1 minute. In debtors, two types of question may come. One is, let's say company is giving a credit of 30 days. Company is giving how many days credit? 30 days. Now they are planning to increase this to maybe let's say 70 days. From 30 they want to make it to 70 days. So they will give you the data. As a finance manager, you need to suggest whether this new credit policy should be implemented or should the company continue with existing 30 days ka credit policy. That is the evaluation of credit policy wala problem. Okay. Again, in this also we have solved at least 7 to 8 question minimum on this only. 1 or 2 questions here I will take you through. We'll not have time for everything. Okay, sir. For this also, if you remember, I had a format. Anybody remembers the format? All 7-8 questions here also we solved in same format. Anybody remembers? Okay, first I'll run you through the format. Sales. Then here no plus minus. I prefer the numerical presentation. First sales, so then variable cost, no? Then fixed cost. No? Point number 4, total cost excluding bad debts. That you will get by adding these two. 2 plus 3 will give you total cost excluding bad debt. Then 3 things: bad debts, collection expenditure, discount. Bad debts usually will be there in all these problems. These two will come in some problem. It will not come in some, but it's a format, so I'm discussing everything. So from your sales, so if you reduce all the expenses, now you will get profit before tax. Reduce tax, you will get profit after tax. Last you will take opportunity cost, and finally you will get the net benefit. If this our building only, huh? Oh, somebody is pulling the chair, or a mixer. Drilling is going on, Oh, okay. Oh, fine, fair enough. Net benefit. So finally, by comparing these two, you'll get net benefit. If this net benefit is positive, you can implement the credit policy. Otherwise, no. I know you would have not got the format if you're looking at the first time. Let's do a thing. Let's run through this format with the help of a small question itself. But same format will hold good for almost every question of evaluation of credit policy. 1 or 2 questions. 1 minute. Quickly, I'll show you. Maybe we'll start with this. Question number 12. Again, I've taken study material question only. Just keep your calculator. Nothing much to do over here. Easy question only. A trader whose current sales are in the region of 6 lakh per annum and average collection period how much? 30 days. Wants to pursue a more liberal policy to improve the sales. A study made by management consultant reveals the following information. Now people, they are thinking currently our credit collection period is how many days? That's our existing policy. Now some consultant has given how many options? 1 or 4 options? 4 options. That they're calling it as A, B, C, D. In A option, you'll increase the collection period by 10 days. Instead of giving 30 days credit, now you will give 10, you'll increase by 30 days means credit period will become 40 days. In credit policy B, you will increase the collection period by 10 days. From 30, it will increase by 20 means it will become 50. Now don't calculate 40 plus 20. No. Right? From the existing policy, compare the increase period. Getting what I said? Don't take 40 and add 20 and make this a 60. On the current policy, we are giving 30 days credit. Now, if you go for policy B, it will increase by 50. From the current policy, it will increase by 20. From 30, it will increase by 20 and it will become 50. Like that. Similarly, tell me what is the collection period for policy C? From 30, it will increase by 30. And so, it will become 60. And here, 30 plus 45. This is the new collection period for the 4 different policies. Okay. If you implement this policy, they are saying sales will increase. Currently, what is sales have they given? Not given. No? Fine. They would have given some information. You can figure it out. Or here only we can see. In fact, given over here. How much is the sales? 6 lakh. Current policy ka sale is 6 lakh. If you go for policy A, sales will be 6 lakh ka increase. It will increase. It will become how much? 6. It will increase by 30 means it will become 6 lakh. 30,000. Here from 6 lakh it will increase by 48. So it will become 648. 6 lakh plus 75. 675. 6 lakh plus 90. 6 lakh 90,000. This will be the new sales under the new policies. Default. Default means bad debts. They have given bad debts. Currently we don't know the bad debts. Maybe they'll tell later. And all the 4 policy these are bad debts percentage. Percentage is on sales. 1.5% of 630 if you do, you will get the bad debts amount. Fine. Now check. Selling price per unit is how much? 3. That means number of units sold, do you know now? 6 lakh is the total sale. So each unit is sold at 3 rupees means how many units are you selling? Number of units sold is 6 lakh divided by 3 which is 2 lakh units. Any problem? No. Average cost per unit is how much? 2.25. In that variable cost is 2 rupees. So total cost is 2.25. And in that if variable cost is 2 rupees means what is fixed cost? The balance 2.25 minus 2 which is 0.25 per unit. And how many units? That means what is your fixed cost? For 1 unit 0.25, for 2 lakh units 50,000. Fixed cost indirectly given. Clear, Sarji? And fixed cost will change as per the policy or it will remain same. Currently, if our fixed cost is 50 means under all the 4 new policy also it will remain same 50,000. Okay. Now, current bad debt loss is 1% and 4 new policy ka bad debt loss given. Additional investment ka return is 20%. We'll come to that in a minute. How many days you have to assume in a year? 360. Now, which policy we have to recommend? So that means we totally have now 1 existing policy plus 4 new policy. Now you tell me which policy would you like to go for? The one which gives the lowest benefit or highest benefit? That means you need to work out the benefit for 5 policies. What are those? Existing ka benefit, existing ka net benefit and 4 new policy ka net benefit. And select the one which gives the highest net benefit. Okay, that only the format I have put it up. Once again we'll run through. First we will take what, sir? Sales. Sales, do you know for all the 5? Yeah, 6 lakh and this number. Check the solution. 6 lakh current policy and then the increase amount. Should I have to explain this once again or sorted? Sorted. Then variable cost. What is variable cost? Variable cost they have given per unit. How much is that? 2 rupees. How to calculate variable cost? We can do it in simple way. Sir, maybe first one I'll show. What is the total sales? 6 lakh. What is the selling price per unit? 3. If you do this, what are you going to get? 2 lakh. That is the number of units. What is the variable cost per unit? 2 rupees. Correct. That means variable cost, we can express it as a formula. Can you tell me what is that? Sales divided by 3 into 2. Sales divided by 3 into 2. Sales divided by 3 if you do, you will get the number of units. If you multiply by 2, because variable cost is 2 rupees per unit, now you will get the total variable cost. That means simple formula. If you want to write, what you can write over here? Sales divided by 3 into 2. Correct? It's not mandatory to write, just showing it to you. So 6 lakh divided by 3 into 2, you do 1 or 2 quickly, we'll calculate. 6 lakh is a sale. Selling price per unit is 3 rupees. Variable cost per unit is 2 rupees. So 6 lakh divided by 3 into 2 is 4 lakh. Correct, Ajay? Understanding now? Calculate for B policy now. How do you calculate? 6,48,000 is a sale. Selling price per unit is 3. By dividing this, you will get number of units. What is the variable cost per unit? 2 rupees. Multiply 4,32,000. Like that, you will get variable cost. Clear? Next, we have to take fixed cost. I think fixed cost we already calculated. How much was that? Fixed cost is 50,000. Will fixed cost change as per policy or same? So same 50,000 I've copied across. I've done a working note and shown the fixed cost over here. That is okay. You don't even know the number. Okay, done. Next. Sales over, variable cost over. Once I'll call out the format for you. If possible, try to remember the format and solve in the same. Every type of question can be, credit policy question can be solved in the same format. Sales, another one, variable cost, then fixed cost. Point number 4 is total cost excluding bad debt. To get that, we take 2 plus 3. Variable cost and fixed cost we add. So add these two, you will get the total cost excluding bad debts. I'll tell you why did I find this in a bit. Done now. Then is this the only cost? We have 3 more. 3 more we can have. Bad debts, discount, collection expenditure. I think discount data not given. Collection expense there or not there. But bad debts is not there or there. Bad debts is there. Bad debts they have given. Current policy ka bad debt is 1%. 1% of sale. 6 lakh ka 1%. 6,000. And respective policies ka they have already given bad debts percentage. 1.5, 2, 3, 4. Take the sale and multiply the respective percentage. You will get the bad debts. Any problem? Here in this particular problem, collection expenditure and one more the discount there or not there. If it is not there, no need to bring it in. 0 components, no need to bring it in exam. Now people, I want you to find profit before tax. How do you find profit before tax? From income, reduce all the expenses. Sales is your income. Then you have to reduce all the expenses. But once again, hang on. Fixed cost and variable cost, I think I've already added. And now, in order to get profit before tax, I'll take column number 1 ka value, reduce column number 4 minus column number 5. That's what I've written here. Because these two have already added and got total cost excluding bad debts. If you want, you can also write 1 minus 2 minus 3 minus 5. That is also okay. So calculate one first policy ka calculate profit before tax for me. 6 lakh minus 450 minus 6,000. 1 lakh 44,000. Any problem? Now reduce tax rate. In this problem we read, is there any tax rate or no tax rate? So tax is 0. Profit before tax also, or rather PAT is also same. Now last data we have to consider is opportunity cost. Opportunity cost. What is this? People check the screen, everyone. Under current policy, how many days credit am I giving to my debtor? 30 days. Sir, if I give 30 days credit to my debtor, I'm collecting the money now or after 30 days? That means for 30 days, my funds are getting blocked. For 30 days, under current policy, and for 30 days, my funds are getting blocked. Yes. If my debtor had paid me today only, if my debtor had paid me immediately, I could have utilized this money and invested for how many days? 30 days and got some return. Now I'm getting that return or I'm losing that return. Opportunity cost. Opportunity cost is always considered for decision making. There is no journal entry for opportunity cost because it is notional. In accounts, we don't pass any journal entry for notional. But in financial management, we always consider the opportunity cost. Once more, I got it. Pakka? Just to be on the safer side, once more, what does it tell me? Current policy, how many days credit? If you're giving 30 days credit, means we are collecting the money after 30 days. Means my funds are getting blocked for 30 days. If my debtor had paid today, if my debtor had paid me the money today, I could have used that money and invested for how many days? 30 days and earned a return to the extent of 20% here given. Required return on additional investment, how much? 20%. I would have got this much return. Now I'm getting this or I have lost it. Lost it. Hence, opportunity cost. Correct. Now, opportunity cost, you tell me, should I calculate it on sale value or cost value? My funds are getting blocked to the extent of sale value or cost extent. That is the reason in between this table, I had one column called total cost excluding bad debts. This number is on which you will calculate opportunity cost. So this number is helpful for us to calculate opportunity cost. That is where this column comes into picture. Otherwise, this column we would have cut off. Once more, I got it. Now calculate opportunity cost for me. How much cost is getting blocked for me in current policy? 4,50,000. For how many days? 30 days. So 4,50,000 into 30 divided by 360. They ask us to assume 360. Into how much return have you lost? 20%. Into 20%. How much is that? 7,500. So tell me opportunity cost ka formula if you want here. Total cost excluding bad debts. In fact, you can say cost of credit sale, but that is nothing but your total cost excluding bad debts into collection period divided by 360 into rate divided by 100. If you do that, you will get your opportunity cost. Opportunity cost alone calculated for B policy for me. Let's see. B policy. Total cost excluding bad debts 4,82,000 into rate. Rate is 20 by 100. How much is the collection period in B policy? 50 days. 4,82,000 into 20 by 100 into 50 divided by 360. How much? 13,380. Correct. Now 1 minute. Hang on. So far, numbers how to calculate opportunity cost are comfortable for everybody. So to calculate this opportunity cost only, I have this column called total cost excluding bad debts. Otherwise, this column was not necessary. Now we already learnt in investment decision, opportunity cost can be a benefit or it could be a cost. Here it's a benefit or cost, benefit or cost, benefit or cost, benefit or cost, benefit, benefit, cost. Anyone is saying both? Both, sir. Cost, cost. How? Sir, you are getting the return or you're losing the return. Since debtor is delaying the payment in current policy, since debtor is delaying the payment by 30 days, this particular return of 7,500, this particular benefit you are getting or you are losing. Losing. If you are losing a benefit, it's a benefit or cost. You probably saw I wrote positive number, so you told benefit. I told no, here I'm not using positive negative, I'm using the representation here. So just because you see positive number here, don't say benefit. No. Okay, now so you are losing a benefit. When you're losing a benefit, obviously it's a cost. Now you tell me, what is your PAT? What is your PAT here? 144. Now this opportunity cost is a benefit or a cost? I mean, these two you will add or you will minus. That's what I've written here. Net benefit is 8 minus 9. These two ka minus you do, you will get net benefit. Clear, sir? Even if you don't know anything, if you just blindly mug up the format, it will take care. You'll be able to solve the question. But it's good to know the logic just in case you're stuck. Everyone okay now? So that way you will get this much net benefit. Now you tell me what is the selection rule. You will select that policy with the lowest net benefit or highest. Which is the highest? This 140 wala number. 140 number is policy A. Okay. So decision is select policy A. One more way they will ask here is, sometimes they will say calculate incremental benefit. Calculate what? Incremental benefit and give the decision. Incremental benefit means extra benefit. How do you get extra benefit? Take the existing benefit and compare it with the benefit of the new policy. Now here check. Let's do it for this. What is existing policy ka benefit? 136,500. Policy A ka benefit? 140. Compared to existing policy, new policy A is giving how much extra benefit? These two ka minus 3606. Similarly, policy B is giving how much extra benefit? Don't compare these two. Existing policy ka benefit, you have to compare it with new policy ka benefit. These two you do minus 315. C ka this minus this, or rather 138 minus 136. These two ka minus 1583. 131 minus 136, positive or negative? Negative. So if they ask you to calculate, you do this only if the question asks, otherwise not required. If they ask you to calculate incremental benefit, you'll have to give the decision based on incremental benefit. Now you tell me, you will select the one with the lowest incremental benefit or highest? Which has the highest? Same. Policy B. That's your solution. So adopt policy A as it has the highest net benefit or highest incremental benefit. That wala problem. Opportunity cost I have calculated as a separate working note. That's all here. Comfortable? Okay. Can I take you through one more question maybe just to be on the, get our understanding little better? Okay. Question number 14. No. A break after finishing chapter. Another 45 minutes. Stay. Okay. After this, one last concept. Over. Now they're saying, "Appa, finally." Yeah. Company ka present credit sale how much? 12 lakh. Existing credit terms is 1 bar 10 net 45. This is again a common terminology they'll use in FM. 1 bar 10 45. What this means is, we will give a discount of 1% provided our debtor pays us within 10 days. If debtor doesn't want to give discount, doesn't want to take discount offer, he has to pay us within 45 days. So credit period given is 45 days. But in order to get the discount, they have to pay us within 10 days. How much percent discount we will give? 1. So that's what here. This 1 is your discount percentage, 10 is your to get the discount, how many days within which you need to pay, and 45 days is your credit period. Done. Okay, this is our existing thing. Go. What is our current average collection period? 30 days. Okay. Sir, why is it 30, sir? It should be 45, no? Sir, some people will go for discount offer. Some debtor will pay us within 10 days and take the discount offer. Some debtors will pay us within 45 days and say, I don't want discount. So on an average, there will be both the sets of people, no? So on an average collection period is 30 days because some will go for discount offer, some will not go for discount offer. Hence, it is not 45 days. Collection period is given to be 30 days. Yes, Saji. Average basically. And now don't do 10 plus 45 divided by 2. Because we don't know what percentage of debtor will take up discount offer, what percentage will not go. So that way, these two, if you add and divide by 2, you will not get 30. You may or you may not get 30 because that data is not given and not needed also. Leave. Current bad debts is how much? 1.5% of sales. In order to accelerate the collection process further, so as to also to increase the sale, companies contemplating, as in thinking, to liberalize the existing credit terms. Now, from 1 bar 10 net 45, they want to go to 2 bar 10 net 45. So, what does this mean? You tell. Instead of 1% discount, now we want to go for 2% discount, provided debtor pays within 10 days. Else, they have to pay us within 45 days. Perfect. If you implement this policy, they are saying it is expected that the sales will increase by 1/3 of existing. Whatever is our existing, under new policy will give us same sales or it will increase by 1/3. Increase by 1/3. And bad debts from 1.5 it will become 2. Average collection period, currently it is 30. Now it will become 20. Why it will reduce? Probably more and more people will start paying within 10 days to get the discount offer. Since more and more debtors are going for discount offer, my collection period will be lesser. I'm collecting the money faster. From 30, it will become 20 days. All this data given, any which way we don't have to worry. Contribution to sales ratio is 78%. 1 second. People, you know this. We have done it in leverage. From sales, if you reduce variable cost, you get contribution. I told you, sales, contribution, variable cost, all this will go hand in hand, interlinked. Now, contribution they are saying is 22% of sales. Therefore, can I say variable cost is 78% of sales? Because sales will be 100. From 100 minus 78 only, if you do, you will get 22, no? Correct, no? Pakka, no? So, if contribution is 22% of sale, means indirectly variable cost is 78% of sales. So, that means in this problem, you know variable cost. 100 minus 22, which is 78% of sales. Opportunity cost of how much is that return? 15%. But do keep in mind, opportunity cost should always be on an after tax basis because you're comparing PAT with opportunity cost. Format, remember? PAT is on what basis? After tax. So opportunity cost also should be after tax. So last problem we didn't tell only. Last problem tax was 0. Last problem tax was 0. So before tax, after tax does not matter because tax itself was 0. In this problem, check. Opportunity cost ka return is how much? 15%. But this 15% we need on a before tax basis or after tax? But they gave what basis? Pre-tax. That means can we take 15% as a return or we need to find? Fine. How do you get some number on an after tax basis? Take the rate and you do 1 minus tax rate. And tax rate is given here. How much? 30%. So will we take 15% as opportunity cost? Now opportunity cost ka percentage will be take the rate and you do 1 minus tax rate. What is the tax rate? 30%. 30% in full number will be 0.3. So 10.5%. So this is the rate we will take for our opportunity cost ka calculation. We didn't do this in the last problem. Why? There is no tax rate. Whenever there is tax rate, watch out. We want opportunity cost on an after tax basis, but here they've given on before tax basis. Next, 50% and 80% of the customer in terms of sales revenue are expected to avail cash discount under existing and liberalized policy. Under existing policy, how much debtors will go for discount option? 50%. Under new policy, how many of them will go for discount option? 80%. Now, in this problem of people, we have bad debts also. We have discount also. Collection expenditure not there. Fine. Format, everything is same. Sales given or not given? Sales not given. Oh, first line only they give. How much is it? Okay. Tell me the format. Let's see how much of it you remember. Point number 1, sales. Then point number 2, variable cost. Point number 3, fixed cost, or sometimes they'll say running cost. Then point number 4, total cost excluding bad debts. This is for helpful to calculate opportunity cost. Point number 4. Point number 5, bad debts. Point number 6, discount. Point number 7, collection expenditure, not there. Then profit before tax. Reduce tax and you'll get profit after tax. Last mein, reduce opportunity cost and you'll get the net benefit. If they ask incremental benefit, do it, otherwise not required. Okay, now same every question. Now existing policy, here we have to do 5 times or 2 times. We have only 2, existing and new. Existing policy ka sale, how much? 12 lakh. Existing policy ka sale is 12 lakh, means new policy ka sales will be 12 lakh or 1/3 more. Calculate 12 lakh ka 1/3, 4 lakh. So new policy will give 4 lakh sales more. So it will become 16 lakh. Clear? Done. Next, variable cost. Since contribution was 22% of sales, variable cost is 78% of sales. Sales ka 78%, you'll give you that number. Okay. Fixed cost not given, 0. Leave. Not given means 0. So total cost excluding bad debts, 4 is equal to what? 2 plus 3. These two addition, same number. These two addition, same number. Then bad debts. Under current policy, what is our bad debts? 1.5%. Under new policy, 2%. 1.5% of sales, 2% of sales. 12 ka 1.5% is bad debts. 16 lakh ka 2% is your bad debts. Okay, Naji. Next, discount. Discount. Now, people, how much sales are you giving? How much sales are we making? 12 lakh. 12 lakh. Now, all of them will go for discount option under current policy, or only 50% they told? 50%. On total sales, you will not give discount because all of them will not go for. How much percentage will go for? 50%. And how much discount will you give under existing policy? 1%. Calculate. 6,000. That is your discount. Okay, Naji. Similarly, calculate new policy ka discount. Total sales how much? 16 lakh. Under new policy, how much percentage of people will go for discount? 80%. In new policy, we are giving 1% discount or 2%? Calculate how much is that? 25,600. That is your discount. Clear? Now, okay. Now calculate profit before tax. How do you get profit before tax? From sales, or 1 second. If you want it in percentage, or if you want it in numerical presentation, it will be sales minus total cost excluding bad debts. 1 minus 4 minus 5 minus 6. Collection expenditure not there. So do this 1 minus 4 minus 5 minus 6. The circle numbers you minus. 2,40,000. Same thing here also. 1 minus 4 minus 5 minus 6. If you do, you'll get profit before tax. 294,400. Yes. And next is your tax. Reduce tax at what rate? 30%. So then you will get profit after tax. Last mein opportunity cost. Calculate opportunity cost for me. Opportunity cost you will calculate on what? Total cost excluding bad debts. But 1 second. Will you take opportunity cost rate given 15%? 15% what they gave in the question was after tax or pre-tax? Pre-tax means before tax. We need after tax. How do you get a number on an after tax basis? Take the rate given and do 1 minus tax rate. So your opportunity cost net of tax or after tax will be 10.5%. Yes, sir. Calculate opportunity cost for first policy, people. Total cost excluding bad debt 9,36,000 into 10.5% multiplied by the collection period. Because We are calculating opportunity. Don't take credit period. Don't take credit period, because opportunity cost means the days for which your funds are blocked. In the existing policy, though you are giving 45 days credit, are you collecting the money within 45 days or 30 days? So your money is getting blocked for 45 days or 30 days. Hence the formula for opportunity cost is credit period or collection period. So we have written it carefully over here. It's actually not credit period, it is collection period. In majority of the problem, credit period, collection period will be same. Here it is same or different. So first priority always for the collection period, because opportunity cost means how many days your funds are getting blocked. Current policy mein, what is your collection period? 30 days. So calculate it for 30 days. How much? Again, 9,36,000 into 10.5% divided into 30 divided by, they ask us to assume 360, na? Anyway, they told us to take 360. Last line mein they'll tell, check 360 days in a year. So calculate how much? 8190. Same thing you calculate for new policy. 12,48,000 total cost excluding bad debt into rate by 100 into collection period and new policy 30 na 20 na. We read the problem. They told 20 days here. New policy ka collection period. Credit period may be 45, but a new policy collection period is only 20 days. So calculate it for 20 days. 7280. Basically 12,48,000 into 10.5% for 20 days is 7280. From PAT you will add opportunity cost or you will minus, and you will get the net benefit. Existing policy net benefit 159, new ka 198. So reject a new policy or implement. Or incremental benefit if they ask. These two you compare. How much extra benefit? Compared to existing policy, new policy is giving an extra benefit of these two minus 38,990. So therefore decision is accept new proposal. Fine now people. Everyone understood? Now one question is, sir, why don't we include bad debts and discount also for opportunity cost calculation? Why are you taking only this number? One no. Blatantly I'll tell, format you follow. It will take care of. If you want to know the logic of it, bad debts will come after you sell. Bad debts, so collection expenditure and all will come after you sell. We are calculating opportunity cost means for how many days my funds are getting blocked. Funds will get blocked to the extent of cost. Bad debts will come only after you sell. That means, have I invested any money for bad debts? No. Hence, we don't include bad debts to discount to collection expenditure for our opportunity cost calculation. Hence, better to have one insertion column here to calculate opportunity cost. Hence, opportunity cost always on this number, if you want to know the logic. Otherwise, format is good enough. Move on, people. Okay. Think this is sufficient for collection. This is enough for 1 minute. One more is there. You want to do one more means 10:30. If you're okay, I'll take a one more question on collection policy. Otherwise, we'll skip. It's okay. 10:30 we can hold up means I'll do. Otherwise, no. Your call. Huh? Factoring will do much. Matlab, after this, I'm saying this problem will take another extra 10 minutes. Factoring, we are doing one question. One is enough. It'll sum up the whole concept enough. I have one good question there. We'll sum up. Totally in class, maybe we must have done 4 to 5 questions, but here one is good enough. Now check. Maybe 30th will do. This is one slightly different question. Same, but one small adjustment is there which we need to pay attention. Question number 30. Again, study material question. Slow payers are regular customers of Good Dealers Limited. We are good dealers. We have a debtor called slow payers. And that slow payers have approached the sellers to extend the credit facility. They want more time. Our debtor is saying, give us more time. We will buy more goods from you. On analysis of past performance, basis on the information supplied, following pattern of payment schedule emerges. So, what is that payment pattern? No? At the end of 30 days, slow payers will pay 15% of the bill. 60 days they will pay 34. At the end of 90 days they will pay 30. 100 days they will pay 20%. 1% is non-recovery. Non-recovery means goinda, bad debts. 1% they will never pay. Okay. I mean, this particular company, slow payers, will pay us in one installment or 4 installments. So this is a problem for one. What is that? This creates problem for, in our format, for one component calculation, this will create problem. What is that? Opportunity cost. Because opportunity cost means you will calculate. Opportunity cost ka meaning is what? For how many days funds are getting blocked. Here funds are getting released in 1 stages or 4 stages. That means you can't calculate opportunity cost once. We have to calculate it 4 times. That's a takeaway of this question. Nothing new. Because you're not recovering the money. 15% you will recover within 13. That means 15% of the money will be blocked for 30 days. So you have to calculate opportunity cost for this. Then 34% will be blocked for 60 days. Like this, you all have to calculate 4 times opportunity cost. Rest everything ditto. Got the meaning? Now quickly, can we run through numbers? Okay. Slow payers want to enter into a firm commitment to purchase the goods for 15 lakh. So for them it is purchases. For us it is sales. So if you extend the credit to slow payers will buy us, or we will be able to sell to this particular debtor how much extra sale? 15 lakh. The price per unit is, selling price per unit is how much? 150. Profit is 5. That means what is cost? Selling price 150, profit is 5 means, can I say total cost to TC is 145 per unit? 145 per unit. Easy. Okay. It is anticipated that the good dealers taking up this contract would mean an extra recurring cost of 5,000. We wrote in the format fixed cost / recurring cost. How much recurring cost will come? 5,000. Opportunity cost is how much? 24%. Fine. Now assume 365 days in a year. You need to recommend, should we extend this credit facility to this slow payers or not? Same wala drama. But here we have multiple policy or this itself. This is one policy where we have to tell whether should we implement this or reject it. What is the decision rule? Matlab, how do you take your decision? Same format may calculate. You will get net benefit. If that net benefit is positive, net benefit negative means reject. That's all. Yes, sir, Sarji. Same format. Sales. How much is the sales? 15 lakh. Start with that. Variable cost. Here I don't know whether it's variable or fixed. They gave total cost. How much is the total cost? 145. How do you calculate? Simple. How much is the sale value? 15 lakh. What is the selling price per unit? 150. If you do 15 lakh divided by 150, what are you going to get? Number of units. What is the cost per unit? 145. Because they told profit is 5. No. From selling price, if you reduce profit, you will get the cost per unit 145. So how much is that? 14 lakh 50,000. I have assumed this to be variable because they have given it on a per unit basis. No. Right. So I have assumed it as variable cost. And you don't have fixed cost, but they gave it as a running cost here extra. How much is the running cost will incur because of this proposal? 5,000 rupees. Bring that in here as well. Running cost, recurring expense given to be 5,000. So total cost excluding bad debts will be these two addition. How much is that? 14 lakh 55. Any problem till here or okay? Everybody? Okay, next is what? 3 things. Bad debts, discount, collection expenditure. Bad debts irka 1% of sale. 15 lakh ka 1%. So how 1%? They gave in the table. Non-recovery means bad debts. How much? 1%. 1% of sale value. Got it. Collection expenditure. Irka. And then one more. What is that? Discount. Discount ledo. Got it. Now tell me, profit before tax. How do you calculate profit before tax? 1 minus 4 minus 5. 6 and 7 not there. 0 components. Leave. Do this. 15 lakh minus 1455 minus 15. How much is that? 30,000. Correct. Tax rate not given. So tax is 0. PAT also will be 30,000. Last mein opportunity cost. But we can't calculate once. We have to calculate it 4 times. How? Let's see. How you will calculate. Tell me. I'll show you the data if you want. Total cost excluding bad debt is how much? 14 lakh 55. Normally, how do we calculate opportunity cost? Total cost excluding bad debts multiplied by rate. Rate of opportunity cost available into collection period. Here we have 1 collection period or 4 collection period. 4 collection period. Hence, we need to calculate it 4 times. Fine. Huh? But don't take 1455. Full amount you will collect in one go or installment is given. So you have to multiply the respective amounts. So first one, let's calculate. If you want, here only we'll calculate. What is total cost excluding bad debt? 14 lakh 55,000. Entire 14 lakh 55,000 you will collect within 30 days or only 15%. So multiply 15%. Okay, now into rate. What is opportunity cost ka rate given? Opportunity cost ka rate given here as 24% into 24 divided by 100. Okay. Now this much money is blocked for how many days? 30 days. So into 30, they're asking us to assume 365 only, no? Into 30 by 365. 4,000? 4,305 I've got. This is the number I have got. I don't know whatever you say. Correct? This number okay na? 4,305. Fair enough. All right. Next, calculate the next one more. Let's see. 14 lakh 55,000 into, now you will calculate full amount is getting released now in 60 days or 34%. Into 34% into opportunity cost ka rate 24 days, 24%. Now you will take 30 days or 60 days. Into 60 by 365 people. Don't take 360. 365 they are asking us to assume. How much is that? 19,570. Okay, now like this you will have to calculate. Same other two, can I review it here only? And now in 90 days mein how much you will recover? In 90 days mein we will recover 30%. So same 14 lakh 55,000 ka 30% recovery into opportunity cost ka rate. Collection period is 90 days. I have to show once more or okay? Data or you want me to write? Okay. 14 lakh 55,000. Full you will collect or 30%? 30% into opportunity cost ka rate into collection period. How much collection period? 90 divided by 365. How much pa? 25,831. Okay, the last one. What is the last one? 14 lakh 55,000 into how much you are collecting now? 20% you are collecting into opportunity cost ka rate into collection period. How much is collection period? 100 days. How much? 19,134. So last one. No? Last one is bad debts. Will not even recover. So I still want to calculate. Fine. What is the period you will assume? Bad debt means you will never collect. So what is the period you will assume? 365 days. You will never collect. Infinite. So for this one, you will not be able to calculate the opportunity cost. Hence only 4. Total you will get the opportunity cost. Total adding all this, you will get opportunity cost to be 68,787. Bring that into the table. PAT is 30,000. PAT is 30,000. Opportunity cost is 68. Opportunity cost you will add or minus. Opportunity cost is not a benefit here. One benefit you are losing. So it is a cost. So from PAT, if you reduce opportunity cost, you are getting net annual benefit or net annual cost or net benefit positive or negative, except a reject. Over. This is your evaluation of credit policy wala problems. Okay, G. Now people, one more aspect which can come with respect to our debtors or receivable management is, or the last one is factoring. Factoring. This is one arrangement we can do. Now what is this factoring? Now people, let's visualize this scenario. We are sellers. We are A Limited. We sold the goods to debtors. Worth how much money? 50 lakh. Now let's say we have given a credit period of 90 days. A has sold goods to debtor and we have to recover how much money? 50 lakh. Credit period I have assumed it to be 90 days assumption. Okay. Now A Limited wants money immediately because they have some fund shortage. And bank people are not ready to give the loan because we have already taken too much loan. Now A Limited, they ask the debtor, "Macha pay." What will debtor say? What will debtor say? Don't even talk to me for how many days? 90 days. You have given me a credit of 90 days means I will pay you only after 90 days. But A Limited is saying, Venunda. Pana Venunda. But debtor is saying, sorry, impossible from my side. Okay. Now when this scenario is there, A Limited can do something. That only something only we're calling it as factoring. Factoring is a simple case where debtors itself we can sell it to a entity. A Limited can sell their debtor itself to another entity. That entity we call it as what? Factor or factoring company, whatever. So here A Limited will sell that debtors to the factor. Okay. And factor will give money to A Limited. When? Immediately. How much is the debtor value? 50 lakh. Factor will not pay full 50 lakh. How much amount factor will pay based on the negotiation. Usually that amount paid will be on the lesser than 50 lakh. Let's say factor told I will make 45 lakh payment. Factor told A Limited I will only give you 45 lakh. But what is the debtor ka value? 50 lakh. But factor is ready to give only now 45. Now factor will wait for how many days? 90 days credit. And then factor will approach the debtor and recover from whom? Debtor. How much money? 50 lakh. So factor paid how much? 45 lakh. Factor recovered how much? 50 lakh. That means one hand mein factor is paying 45. Another hand mein recovering 50 lakh. That means 5 lakh extra factor has. That is factor ka commission. Done na? This is the whole process of factor. Done na ji? Where you can sell your debtors to another entity. So this way everybody happy. Why? Sir, A wanted the money right now. Did he get a? Yeah. And factor through this process is earning some commission. And debtor is neutral. Debtor wanted to pay after 90 days. Instead of paying A Limited, debtor is now paying the factor. So it doesn't really make any difference to the debtor as such. So that way it's a win-win arrangement for everybody. Clear, people? This is the meaning of factoring. Okay, if you don't want to sell the debtors to your factor, you can also make factor your collection agent. A Limited, instead of selling the debtors to the factor, A Limited can tell the factor, A Limited can make the factor gunda. You know, bank people have gundas, recovery agents. No, A Limited can make the factor recovery agents. Like A can tell the factor, go on my behalf and collect the money. From whom? Debtors. Because debtors don't pay that easily. But when hatta kutta gundas come, bodybuilders come, then debtor will pay. Take my money, take my building or bungalow, everything you take. Like that. My wife, okay. So this also arrangement can be possible. Instead of selling the debtor, we can make the factor our collection agents also. But usually we make the sales. Okay, people. Overall, this is a setup. Meaning is clear. Now, factoring is of two types. Factoring arrangement can be entered into two types of arrangement that we call it as with recourse, without recourse. With recourse, without recourse. Sir, English word recoursing means what? Recoursing means going back. Recoursing means going back. Now, let us say after 90 days, this debtor, he told factor, Poda, I will not pay. Debtor told the factor, I will not pay. Now, what will the factor do? Come back to A Limited and recover the money. If that is the factoring arrangement, means we call it as with recourse factoring. With recourse factoring means what? If debtor's default, factor will come back to the original seller and recover the money. If such is the factoring arrangement entered, means we call it as with recourse factoring. That means in with recourse factoring, who will bear ultimately bad debt risk? Factor or seller only? Original seller only will have the bad debt risk. In which case, with the recourse wala factoring. There is another factoring called what? Without recourse. Without recourse means if debtor does not pay the factor, can factor come back to A Limited or not permitted? Not permitted. Because that is the nature of arrangement. Such an arrangement we call it as what? Without recourse. That means now you tell me who is bearing bad debt risk? Factor. In without recourse arrangement, bad debt risk will be bear by the factor. Obviously, if here factor is taking more risk, no, so commission will be same or higher commission. Here with recourse may comparatively lower commission. Here the commission will be on the higher side. That how much and all, it's a negotiation. That's fine. That's not our headache. Done now. This is the meaning of factoring. Now, how from the examination perspective, what we need to worry about is they will give you the data and then say company should get into factoring arrangement or reject it. Should the factoring proposal be accepted or should the factoring proposal be rejected? What do you think is a decision rule? So because you enter into factoring arrangement, there will be some benefit also, there will be some cost also. If benefit is greater than the cost, if benefit is greater than the cost due to factoring, then accept. Benefit is lesser than the cost, then reject. Allah, extra points. That I will tell you. If benefit of factoring, if it is greater than cost, straight away accept. If benefit is lesser than cost, straight away reject. Allah, some extra you'll have to do. What extra I will tell you in pointers. Clear? That is the scope of factoring problems. Now factoring also we have same format. One format is there. We have done 3-4 questions in our regular batch. Say every question can be solved in this format. We will run through this format. Don't worry about I've written too much story. It looks big. Quite easy only. It's like format. Yeah. FM is full of formats. Now people, first keep an open mind. First I will quickly discuss this with you. Then we'll apply. It's better learned with numbers, but I'll still make an attempt at theory level first. Now people, first this is a working note, okay? We need to do a working note. What are we selling to the factor? Sales or debtors? As an entity, we are selling to the factor sales or debtors. That means first we need the debtor value. They will not give you debtor value. They will give you sale value. From sales, can you find out debtors? From sales, can we find debtor? Yeah, how? Sir, sales will be on a 12-month platform, whole year. But debtors, will you give 12 months credit or lesser? That means tell me the formula, what is that? Take the annual credit sales, so divided by 12, 365 or 52. Into what? We need the factoring period. In some problem, they will give factoring period. That's the first priority. If that is not there, you will take the collection period. Okay, sir? That way you will get the debtors. Any problem? No. Now factor will pay full amount. No. Usually in these sort of problems, because factor will get the money later, no? So they will say there will be some reserves. Reserve means currently withholding the money and releasing it later. That reserve could be 5%, 10% or whatever. So they will mention in the problem. So reserve is 10%. If it is 10%, what do? Take the debtor value and multiply 10%. You will get the reserve amount. Easy. Fine, people. Clear so far? Similarly, will factor do all this activity at free of cost or factoring commission will be there? So minus commission you do. Commission, let's say, is 10%. So debtor, whatever debtor value you have got, multiply the commission rate. That will be given to you in the question. You will get the commission amount. Now in factoring arrangement, what will happen is, now you think, factor will first pay the amount to us and then recover commission. On one hand, a factor will pay, another hand may recover commission, or both will be net off. Net off. So when we sell the debtors to the factor, full money will not be given. From that, first what will be reduced? Commission. Again, what will be reduced? Reserves. And then you will get what? The amount which the factor is ready to give it as advance. The amount which the factor is ready to give as advance. This is the amount available for advance, we will call it. Okay, sir? Alright. Usually in our examination problem, there will not only be commission, there will also be a interest. Because factor is giving you the money in advance. No? In our previous case, we had to collect the money after 90 days. But factor is giving the amount immediately. So hence, there will also be some interest. It's a negotiation. Practically, interest may be there, it may not be there. But in all our examination problem, interest will be compulsorily there. How do you calculate interest? Is take the amount available for advance, multiply by the interest rate which will be given to you in the question, multiply by the factoring period which will be given to you in the question. So just period, whatever. I'll tell you this with numbers again. Now this also, in factoring, every payment collected upfront. Now that means factor will not give this much amount. Factor also has to collect interest from us. So interest also will be deducted and the balance will be the amount advanced by the factor. I know that fully you might have not got it if you're learning in the first time. I'll take you through the numbers. It will get better. Fine. Now this is one working note we need before we evaluate the factoring proposal. Now when you do the evaluation of factoring proposal, due to factoring proposal, there will be some benefit also, there will be some cost also. There will be benefit also, there will be cost also. First, benefit. Now people, in all our problems, the assumption is it is without recourse factoring. It is what factoring? Without recourse. Without recourse ka another name is non-recourse. I mean, tell me, original seller will bear bad debt risk or factor? That means bad debt risk I have or I have avoided. One loss I have avoided. By doing what? factoring. So this is a cost for me or a benefit for me? One loss I have avoided means it becomes a benefit. So first benefit due to factoring is savings in bad debts. They will give it to you in the problem. Okay, sir. But do keep in mind before you do this particular statement, no? In this statement, every number has to be on an annual basis. It has to be on what basis? Annual basis. But factoring period may be 40 days, 50 days, 60 days. But whatever number you put in this particular statement, every number should be on what basis? Annual basis. Why? I'll tell you in a bit. Do not forget that. Most of the bad debts or good debts and all will already be on an annual basis. If it is not there on the annual basis, you need to convert. Why? Last step may I'll tell you, or when the question may I'll tell you. First, you will take savings in bad debts. Next, people before factoring, we had to call up the debtor and ask for payment. That means to collect the money from the debtor, we had to have a person. We had to have some telephone charges, courier charges, person salary. All these are administrative costs to collect the money from debtor. Now we have to collect the money from debtor or factor will collect. So all this cost will come or saved. So there will be some savings in the collection cost or administrative cost. It will be given to you in the problem. Take that. Done now. There is one more. This comes in some problems. Majority of the problem it will not come. If due to factoring, if there is any reduction in the collection period, you'll have to calculate this. I'll talk about this maybe after one problem, leave this. So basically these two are the benefits that usually you get in the problems. Okay. Now, only benefits will be there or cost also will be there. Two costs we have already identified. Tell me what are those? Interest to commission. Interest to commission. Reserve. A reserve is not a commission. A reserve is not a cost. Reserve means temporarily factor is holding this money. Later factor will give it off. So this is not cost. It's temporary holding. So what is really cost? Commission and interest. But this commission and interest we have calculated for the factoring period. But here we need on factoring period or annual basis. Annual basis. So annualized commission you have to take. Annualized interest you have to take. How? I'll tell you in a bit. And sometimes there will be due to factoring, they will say we have to incur some one-time cost and all. It will be there. Some other cost. If it is there, it will be given to you in the question. If it is not there, no problem. So this is your benefit. This is your cost. If benefit is greater than the cost, if benefit is greater than the cost, that we call it as net annual benefit. If this is positive, straight away what you will do? Accept the factoring proposal. If you don't get net annual benefit, if you get rather net annual cost, when it will be net annual cost? When cost is only more than the benefit. If it is net annual cost, we can't reject the factoring proposal. We have to calculate something called effective cost of factoring. Effective cost of factoring. That's given by the formula net annual cost divided by amount advanced by the factor into 100. Or in simple terms, you remember cost of debt? What is the formula? Cost of debt to cost of capital. I told one simple way to remember that formula. What is that? Payment by interest. Payment by interest. Here, net annual cost means this is the payment you are giving to the factor. And what did the factor give to us? Amount advanced by factor. So, payment divided by receipt. Payment is our net annual cost. Receipt is amount advanced by the factor. That if you do, you will get something called effective cost of factoring. Based on this, we will be able to decide that. I will take you through one question. Better understood. I know that still, if you're doing first time in this format, you might have not understood it. No worries. One question we will run through. Easy only this is. Can we go through one question? It's a case-based scenario. It came in MTP1. Currently in our study material, the factoring questions are very straightforward. It's a net annual benefit case. So that means few working notes we can avoid. I don't want to take that up. So in MTP and RTP, they had asked a couple of good questions in factoring. So I'll take up this and we will review this question. This is a good question to review the factoring wala solutions. So check everybody. Just keep your calculator. Easy only it is. Any industries or there in manufacturing and that's blah blah waste. We will go for relevant information. Total sales evado 200. Sir, we are doing factoring. Factoring comes on total sales or credit sales? Do you know credit sales? How much? 80%. Take your calculator. How much is credit sale? 200 ka 80%. 160 lakh. This is your total credit sales or rather annual credit sales. Agreed. Okay, let that number be there. The company has a credit policy of 2 bar 40 slash or 2 slash 40 net 120. What does it mean? 2% discount we will give it to our debtor, provided debtor pays us within 40 days. Else they have to pay us within 120 days. Now some people will go for discount option, some may not. So average collection period, will it be 120 or 40 or something else? Something else. Check, have they given? Past experience of the company have told that on an average 50% of the customers will go for discount. Balance will pay us within 120 days. So usually average collection period will be given. Here given or not given. That means we need to find. How do you find ACP? ACP means average collection period. Now people, in order to get the discount, debtor has to pay us within 40 days. What percentage of debtor will go for this option? 100% or 50%? Okay. And what about the balance 50%? They will pay now or in 120 days? They don't want discount means they will pay within 120 days. So how much is this? 20 plus 60, 80 days, huh? Yes, everybody. So average collection period is 80 days. Average collection period is 80 days. Correct. Got it. If they have given means we will take it. If they don't give us means we will have to calculate. Here not given, so we calculate it. How? If you want once again, if what percentage of the customer will go for discount? 50%. In order to get the discount, customer has to pay us within 40 days. So 40 days, few of them will pay. Few of them will pay within 40 days. What percentage of them? 50%. Hence 50% ka 40. What about the balance 50%? They want discount or they don't want discount? If they don't want discount, they will pay within 120 days. So 50% of the customer will pay us within 120 days. So both are there. Hence add, you will get average collection period 80 days. Any problem? No. Okay, move along. With escalating costs associated with in-house management of debtors coupled with the need to unburden management with the CFO is examining factoring. Now they're thinking, should we go for factoring or not? A goal they're giving. Whom will read all that? Firm is spending 2,40,000 per annum to administer the credit sale. Currently, to follow up with the debtor and collect the money from them, how much company is spending? 240. Now, if you go for factoring, should we follow up with the debtor or not required? Who will do this activity? Factor. So this cost we will incur or we will save. This is a benefit. You remember in that statement, every number we should express on annual basis. This 240 is already on what basis? Annual basis. These are avoidable cost if you go for factoring. So this is what? Benefit. So let's go to our factoring statement and savings in administrative cost 2,40,000 benefit. Take da. Correct. Okay, come back. Next, what they gave. Okay. The main elements of factoring proposal are: factor will charge 2% commission. It will pay advanced against receivable at an interest rate of 18%, withholding 10% as a reserve. So two costs we have identified: commission, interest. Both are there. Reserve is not really a cost; it is just a temporary hold up. Later it will be released. Fine. Company has an option to take long-term loan at what rate? 15, or working capital loan at 14%. 1 minute, people. This we did not read. Financial controller has estimated bad debt loss how much? 1%. Now, people, what is the assumption we make? It's a with recourse factoring or always without recourse? If they don't mention anything, we always assume that it is a without recourse factoring, or another name, non-recourse. If it is without recourse or non-recourse means, should we have to bear this bad debt risk anymore, or factor will take it up? Factor will take up this loss. That means one loss I will incur or I will avoid. One bad debt loss I can avoid means it's a cost due to factoring or a benefit. Benefit. But people, this is 1% of sales, 1% of credit sales. 200 lakh is your total sales. 80% of that is credit sales. So if you do this, you'll get 160 lakh. 160 lakh ka 1%. That is your bad debts. Clear? How much is that? 1 lakh? 60,000. Cost or benefit? Sir, annual, sir. Yeah. 200 lakh was what sale? Annual sales. 200 lakh ka 80% if you do, you will get annual credit sale. Annual credit sale ka 1% if you do. Obviously, it is what? Annual savings and bad debts only. How much? 1 lakh 60,000. Yes, sir. Both these numbers are already on annual basis. Yes, no. The sales is an annual basis. So, need a minute? Can I move forward? Okay, now to cost we have identified. The funda is that only. Should we take up this factoring or not? They've asked MCQs. We'll read the MCQs later. First, we will think of it like a normal problem and solve. Now, people, this is your evaluation. This is your answer in a way. Okay, but before to get this answer, we need to prepare one working note. Remember working note number 1 mein, again, are we selling sales to the factor or debtors? Debtors. Okay, debtors will come due to total sales or credit sales. Take your calculator. What is your credit sales? 160 lakh. Directly I'll write 160 lakh. Here they have given the data in months or days or weeks or days. And are they asking us to assume 360 somewhere? Yeah, here. Consider how many days in a year. 160 lakh is a data for how many days? 360 days. But on an average, our collection period is 360 days or 80 days. First priority is factoring period. Have they given factor period? No. That means we will use average collection period next priority. So for 80 days, what is the value? For 360 days, the value is 160 lakh. For 360 days, the value is 160 lakh. Yes, no, people. For 80 days, how much is the value? Why 80? Why 80? Collection period. Debtor will come due to collection period. No, we are trying to find debtor balance. Using sales, we are trying to find debtor balance. 160 lakh is the value for 360 days. For 80 days, how much? 30? 35.55 lakhs. Here this number. Got it? Now, will the factor give us full money or first commission? How much commission factor they told they will charge? 2% commission. Calculate. The debtors ka 2%. 35 lakh ka 2%. 71,111. Done now. Now will debtor pay us 35 lakh 111 or first he will deduct commission? Commission. That's it, or even reserve is there. How much reserve? 10%. This 35 lakh 55 ka 10% only you calculate. Both these are calculated on this number only. 35 lakh ka 10%. 3 lakh 55 555. Correct? So that means how much advance factor is ready to give? 31 lakh 28 889. Till here, anybody, any doubt? Number wise, all are okay. Will factor give this much amount or one more deduction is there? Interest. Interest. How much interest rate? Check the question. How much interest factor is collecting? Where we saw? Here. Factor will pay the amount after withholding an interest of 18%. Take your calculator. How much is the amount available for advance? 31 lakh 28 889. Okay. Is factor giving this amount or interest is there? Take this number and multiply 18%. Okay. Take this number and multiply 18%. Done. Done now. But this 18% is for whole year. Now, why is, if you want to know the logic of interest, why is factor collecting interest is? Think from factor's perspective, not company. Think from factor's perspective. What is the average collection period? 80 days. Factor is giving the amount now. But factor will get the money from the debtor after 80 days. Factor will pay the seller now, but factor will collect the money from debtor after 80 days. That means money is getting blocked for the factor for how many days? 80 days. If the factor had collected the money immediately, factor would have invested and earned how much return? 18%. Now factor is getting this or lost return. Now that means for factor this is a loss. No. Will he let go of that loss or recover? But this 18% is for full year. 18% is for the full year. Factor lost full year's interest or only 80 days ka. Hence into 80 divided by 360. Okay now people. Hence if you want it as formula, tell me now this is same thing. I've written it as formula there. That's the reason it looks big. With numbers it is very easy. Now construct your formula for me here. Tell me interest. How do you calculate? Amount available for advance into rate by 100 into first priority is factoring period. Factoring period if they have not given means collection period. ACP. Divided by 360, 365 or whatever as per the problem. You will get this. Will factor recover this interest from this later on or everything now only? So from this 31 lakh 28 889 factor will deduct this and finally give us how much advance? 30 lakh 3733. Now this is the first working note. Everybody okay now? You want me to take you through once again or comfortable? Okay. Now people, now we have identified two costs from this working note. Commission and interest. But the problem is both this are on which platform? See, you calculated commission on debtor. Debtor was on how many days platform? 80 days. Interest you calculated for 80 days. But this statement, every data should be on what basis? 80 days platform or annual? So reconvert. So very simple. Commission 71,111, or maybe I'll use this. Commission is 71,111 for how many days? 80 days. Why 80 days? You calculated the debtor only as 80 days. No, average collection period is 80 days. Correct? So 71,111 is a commission for 80 days. How much for 365 or 360? What did they say? For 360, how much is the commission? 71,111 is into 360 divided by 80. How much is that, people? 3,20,000. Got it? Same goes for interest. How much is this interest? 1,25,156. This interest you calculated for how many days? 80 days. Now we want it on annual basis. Annual means 360 days. For 360 days, how much is the interest? 1,25,156 into 360 divided by 80. 5,63,000. Fine, people. Any other cost they have given in the problem? Sometimes they will say some one-time cost and all will be there. Given or not given? Not given. So 2 benefit, 2 cost. That's it. Give me the total benefit. That's it. I'll tell you why we bring it on annual platform. First, let's go ahead a little. To both the benefit, if you add, what are you going to get? These two addition, if you do, you'll get total annual savings or annual benefit, you can call. How much? 4 lakh. What is the similarly total annual cost? These two addition. 8,83,202. Happy or sad face? Sir, benefit savings is only 4 lakh. Cost is 8 lakh. That means cost only is more. So it's a net annual benefit wala case or net annual cost wala case? Net annual cost wala case. Simply do A minus B. If it's positive number, net annual benefit. Negative number, net annual cost. Format will take care of it. So 4 lakh minus 883,202. What are you getting? Negative 483,202. That means this is a net annual cost. So due to factoring, we are getting a benefit or we are incurring more cost. How much extra cost you are incurring? 483,202. Now this is extra cost in amount. This is extra cost in amount. I want it in percentage. I want you to express this in percentage. Here extra cost is in amount. Express the same in percentage. How do you find cost percentage? KD, simple formula. Payment by receipt. Payment by receipt. How much are you paying? 483. What did you receive from the factor? This much. So divide these two. Hence effective cost of factoring ka formula. Tell me now. Net annual cost divided by the amount advanced by the factor. Or simply payment divided by receipt. So do that. 4,83,202 divided by 30,03,733. 4,83,202 divided by 30,03,733. How much, people? 16.08%. That's formula. Once again, I've written it for you here. Net annual cost divided by amount advanced by the factor into 100. Till you're good. Yes, everybody? Sir, one minute. If it is net annual benefit, you don't have to calculate this because you don't have cost percentage. It's a benefit case. If it is net annual benefit, straight away you'll write a decision. What is that? Accept. If it is net annual cost, don't say reject. Don't say reject. First calculate what? Cost. You got net annual cost in amount. Express that in percentage. That only we're calling it as effective factoring cost in percentage. Why do we do this? Sir, we need money. First of all, why are we thinking we will go into factoring? We need money. Will anybody give money at free of cost? Same money if you collect it from bank will charge interest. Same money if you collect from debenture holder, they will charge interest. From equity shareholders, there is cost of equity. So that means factoring also can have a cost. Factoring can also have a, what is factoring ka cost? 16% on an annual basis. Sir, if you don't want to take money from factor, option for you is to take money from bank. And bank charges how much interest rate, Prabhu? 15% for long-term loan, working capital loan, 14%. That means now factoring reject. Factor is charging 16%. Bank is charging only 15%. Now understood the decision rule. Tell me in sentence, let's see. If it is net annual cost, first find it out in percentage. Compare this percentage with the banker rate. Compare this percentage with banker rate. If bank ka rate is lower than factoring ka rate, or rather if factoring ka rate is, if it is greater than banker rate, then reject factoring, go for bank loan. Suppose this factoring ka cost you found out and you got it as 10%, then bank is charging 14 or 15, factor is charging only 10. Now you will go for, that is what is the decision rule. Since effective annual factoring cost 16% is greater than bank rate, reject. If it was other way around, accept. Okay, Naji. Now, next question. Sir, why do we get everything on annual number? Because this bank rate, 15% or 14%, it is not for 80 days, it is for annual. 80% ka rate, can you compare it with whole year ka rate? No. Hence, we get every number on what basis? Annual basis. Then only you will be able to calculate annual cost of factoring, which you will be able to compare and take the decision. That is the logic of annualizing the numbers. Easy, pakka, that's it. This is the whole or the funda of factoring. Format will take care if you don't want to take too much load. Okay, now people, that's the reason we have written it. But once, let's see. Give me a quick recap. Only factoring alone? Yeah, yes, Allah. You should tell. Yeah, you're waiting for me, I'm waiting for you. So, okay, I'll only tell. First, people, one working note. What are we selling to the factor? Debtors. First, find debtors. Debtors you will calculate with the help of credit sales. So, take credit sale divided by 1252 or 365 multiplied by the factoring period. First priority missing means ACP, average collection period. You will get debtor. Will though we are selling debtors to the factor, will factor pay full amount or he will deduct two things? What are those? Commission, interest. It will be given. Our commission will be straight away percentage. Or reserve also will be straight away percentage. Reduce that. You will get amount available for advance. Will factor give this or one more? One more, which is what? Interest. Take amount available for advance. Calculate interest rate. But that interest rate will be for whole year. Is fund getting blocked for factor for whole year or factoring period? So that means what is the formula for interest? Tell me. Amount available for advance into rate by 100 into factoring period divided by 360 or 365. Factoring period missing on there? Average collection period. Okay, na? So reduce this interest. You will get the amount of advance given by the factor. Okay. Then the evaluation statement. Okay. Every number in the evaluation statement should be on an annual basis. Benefit to cost to. Due to factoring, you will get few benefits. One is bad debt you can avoid. Bad debt loss you can avoid. Then some administration cost you can avoid. Those two are your benefit. By totaling up, you will get the total annual benefit. Then there will be cost. Cost are usually two things. Commission, interest. But both this commission and interest is on annual basis or factoring period. So first annualize them. Get them on annual platform. So you'll get the annual commission and annual interest. Any other cost, if it is there, bring it in. Compare benefit with your total benefit with your total cost. So if your benefit is greater than the cost, then you'll get net annual benefit. Then straight away factoring proposal accept. If benefit is lesser than the cost, then you'll get net annual cost. In that straight away reject or factoring cost percentage. First find factoring cost percentage. Simple, payment divided by receipt. What are you paying the factor? Net annual cost. What are you getting from the factor? Amount advanced by the factor. So the formula for effective factoring cost is what? Net annual cost divided by amount advanced by the factor into 100. Compare this particular factoring cost with your bank rate. If factoring cost is lower than bank rate, accept factoring. If factoring cost is greater than bank rate, reject factoring, take a loan from bank only better. That's all. That's what I've written here as theory. I think it's sorted now. So it's fine. No? Okay. Last one, 5 minutes. Small is there for creditor management. We'll finish off this and we'll leave. Creditor management is a 2-marker question. Majority of the time is it doesn't come. If it comes, 2-marker adjustment somewhere in some case they may fit. What is creditor ka drama is, till now we were evaluating whether to give extra credit to our debtor. In creditor management, what is a pain point or point of concern is creditor is ready to give us some discount to us. Creditor is ready to give us some discount to us, provided we pay on the credit date or earlier. Creditor is telling us, if you make an early payment, I will give you discount. Okay. Now the question here is, should that discount offer be accepted or should that discount offer be rejected? That's a problem. Okay. That too, one simple formula is there. Annual discount is a benefit, no? So you have to annualize it. Annual discount benefit percentage is given by the formula D divided by 100 minus D into 365 divided by T. Since you want it in percentage, finally you will multiply by 100. What is it? D divided by 100 minus D into 365 divided by T, finally multiply by 100. D here is for discount. T here is for early payment days. How many days you need to pay early to get the discount? 5 days early, now 10 days early, now how much? That is your T. T is not total period. T is the pre-payment days or early payment in days. So do this, you will get the annual benefit discount percentage. Then you can take the decision. I'll take you through one quick question on this, 5 minutes. And then we can say, whatever. Where is it? Here. Okay. It's a study material question only. Question number 34 in our class notes. Oh no, it's an RTP question rather, not study material question. Now, A Limited is in the manufacturing business and it acquires raw material from X Limited. Fine. As per the terms of the agreement, payment are to be made within 40 days. So creditor is giving how much credit period to us? 40 days. However, A Limited, we are buying, no, we are A Limited here. We have a choice. What choice? Of paying 98.5 per 100 rupees. A Limited has a choice of paying rupees 98.5 per 100. That means instead of paying 100, we have a choice to pay 98.5. That means we will get how much discount? Correct. It owes to X. But in order to get this discount, you need to make the payment before 10th day. Normal, what is a credit? 40 days. In order to get the discount, we have to pay within 10th day. So how many days early we need to pay? T people is early days. Normal credit 10 days. To get the discount, we have to pay before on or before 10th day. So how many days early we need to pay to get this discount offer? Instead of paying on the 40th day, we have to pay on the 10th day maximum. So we have to make the payment how many days early? 30 days early. That is your T. Agree? Now substitute in the formula. Simple. What is the formula? D divided by 100 minus D into 365 divided by T into 100. D is discount. Instead of paying 100, we are paying 98.5. How much is the discount? 100 minus 98.5. 1.5. Divided by 100 minus D into 365 divided by T. T is how many days early are you paying? Instead of 40 days, we are paying on the 10th day. So early payment is 30 into 100. How much? 18.52 percentage. Okay, people. That means you're getting a benefit from creditor. You're getting a benefit from creditor. That benefit if you express on annual terms, like factoring you expressed on annual terms, no? Same creditor ka benefit if you express on annual terms, how much is the benefit percentage? 18%. Read one more line. Examine whether discount offer should be accepted, provided average billing is 10 lakh. We don't have to pay 100 rupees to this creditor. How much we have to pay? 10 lakh. Alternative investment gives how much return? 15%. Now check, people. If you take up the discount offer, how much annual benefit we are getting? 18%. Now I have money, I have extra cash. If I have extra cash, I can use this extra cash to pay the creditor early and take up discount offer. If I take up this discount offer, what is my annual benefit percentage? 18%. If I don't take up discount offer, what will I do with this surplus money? Invest. If I invest, how much return will I get? 15%. Now you tell me, as a finance manager, what would you recommend? Investment is giving a return of only 15. Creditor ka benefit percentage looks like 18, which is better. So what is the decision rule? What is the decision rule in sentence? Final decision rule here is accept. But in sentence, if I ask you, what is the decision rule for discount offer? What you will say? if the annual discount benefit percentage, if it is greater than investment ka return, if it is greater than investment ka return, go ahead and accept the creditor ka discount option. Suppose this annual discount benefit percentage was 12%. How much is it? Instead of 18, if it was 12%. If you save money, if you invest in investment, how much are you getting? 50. Now you will go for discount option or investment option. So your discount will be rejected. Clear, sir? Everybody good? That's all this is. Now, why do we get this on an annual platform? Is this investment percentage will be on annual. Hence, this also, there's a simple formula. I had explained you the logic of this. Now, I think you don't need all that. This is okay now. This is basically a formula which is annualizing the benefit. Okay, which is annualizing the benefit. Or if you want 2 minutes, I'll tell you that. GP percentage, tell me people. GP percentage, tell me. GP by sales into 100. Same way, here instead of paying 100, we are paying 98.5. How much benefit you are getting in value? 1.5. 1.5. Because we are paying 1.5 rupees less. This is your GP. Think on like GP terms, easy. GP divided by sales. How much are we paying the creditor? Really 100 or 98.5? So that means what is the percentage? Tell me this. We are getting a benefit of 1.5 by paying 98.5. How much is this? 1 point. This is the benefit. This is the benefit. But for whole year or for making 30 days payment early? For making the payment 30 days early, you are getting a benefit of 1.52 because you will get the benefit only if you'll get this discount only if you pay the creditor how many days early? 30 days early. Now annualize this. 1.52 percentage is a benefit for whole year or 30 days? 30 days. Now this investment percentage is on 30 days platform or 365 days. So hence annualize. 1.52 percentage is a benefit for 30 days. For 365 days, what is the benefit? Calculate. That's all is formula to calculate. You don't need actually formula. But in exam, answer in formula only. Don't write like this. Because people will not understand. They'll think you copied. Because the invigilator will not know. They will only refer the ICA ka suggested answer will always be in formula. So write in formula only. So this way only you will solve an exam. What is that again? D divided by 100 minus D into 365 divided by T into 100. Okay. If you don't want to solve on 100 platform, you can also take full amount also solve. Full amount also you can solve. You want, I've showed it here. If you want it, ideally better to solve like this. So, but this also I've solved it. You'll get the same answer. I'm just showing you. If you want, you can use that as a reference. Or exam may just follow this. It's fine. Okay, people. Either you can take 100 and platform and solve, or you can take full value and solve. Answer both case will be same. It will not change. Okay. Now what do we say? Expected breakfast breaker. Okay, people. I think with this working capital management, whatever we had in plan, we have completed. Thank you for your time and patience. Bye bye. Hello, people. Let's quickly run through FM RTP May 2026. Overall, a pretty good RTP. They've added like 4 to 5 good questions or different types of questions. Remaining are repetitive. Okay. Now, in this particular RTP, we'll be running all the new questions. Whatever is newly added, which is not there, that will be quickly running by. Okay. First is a case-based question. Carefully, let's read the question. Before, as I keep telling you people, cases will be usually quite big. So don't waste your time reading the cases entirely first. Always have a quick look at the requirement. Quick look, okay? One, they are asking something about face value of the share. Then they are asking market price as per Walter Modulo. Something about optimum dividend payout ratio they are asking. Something about capital employed or earnings they are asking. And anything else? And then they are saying something about capital employed, estimated earnings growth rate. So looks like dividend decision and cost of capital ka combined wala case study. It looks like so far. Fair enough. I think this is good enough. So with this in mind, let's see how we'll read the question and figure out. ABC is a new company, newly incorporated company. They commenced their operation 2024, it seems. Fino, by issuing equity shares at face value. And how many equity shares are there? 10,000. That's the main, probably one information we may need. So 10,000 existing share company has. They ask face value, no? So maybe this information is probably helpful to find that. During the first 2 years of operation, 24 and 25, it has earned a profit of 1 lakh in 24 and 1 lakh 4,000 in 2025. So looks like profit has increased by 4%. 1 lakh plus 4% if you do, you will get 1 lakh 4,000. So therefore, they have given growth rate to be 4%. 1 lakh for plus 4% automatically if you do 104 it is. Cost of equity, they have only given 8%. Based on Gordon's model, market price of the share at the end of 2025 is given to be 162. Sir, Gordon sir's ka formula? D1 divided by K minus growth rate. Looks like K is available, growth rate is available, price is also available. Okay, so maybe use that information to find D1 maybe. Let's see. Okay, although information, no company has been following traditional dividend payout policy, management is now concerned about whether this policy makes a full goal. They have given now full story they will give. All that main matter not required. We'll read. We have anyway read the requirement, so we'll focus more towards the value, not the stories. Now, finance team has been instructed to evaluate dividend policy both using Gordon and Walter. So both the models we need to use and figure out something. Okay, I think that's the only data available. Other than that, any numbers are given? No numbers. No numbers. Now let's read the first requirement once again. You need to find out the face value of the share as well as a rate of return on retained earnings. That is R. They've asked R. Face value we'll figure out later. Now people, R. How can I get R? Is there any formula that targets R? Growth rate is given. Keep that in mind. G is equal to B multiplied by R. G is available. G is available. Somehow if you can find out B. Somehow if you can find out B. R also you can figure out. B is retention ratio. Now 1 second. Using this data what they gave cost of equity, growth rate, price of the share. Using this formula I can find out D1. Right? If you know dividend is expressed on EPS. So that means if I can find out using D1, if I can find out dividend payout ratio, then I'll be able to find out the retention ratio also. If 70% is dividend payout ratio, then retention ratio B will be balance 30%. Yes, sir. I mean that is our clue. Yes, sir. So can we do it now? Okay, Gordon's ka first formula. Tell me what is Gordon's ka formula? D1 divided by K minus G. Substitute. D1 we don't know, but price they only given 162.24 is equal to D1 we don't know. Cost of equity is 8%. Growth rate is 4%. When you solve, you will get D1 to be 6.49. Till here, any problem, anybody? Okay. But one here, people keep the dates in mind. Here, dates are important. Now, when did they give the price of the shares? Which year ka check? This is the market price of the at the end of 2025. The dates are important over here. So this is the price. This is the price at the end of 2025. So you already know the formula. For if you want P naught, you will take D1. If you want P1, you will take D2 divided by K minus G. If you want P2, you will take D3 divided by K minus G. So that means if this is the formula, or if this is the price for, if the price for 2025 means this D1 what they have taken, this is which year ka D1? Or 1 second. This is 2026 ka D1. Agreed. Because currently they have given price at the end of 2025. So D1 here refers to 2026. All of you are comfortable with this? Correct now? Now people, do you know? Now dividend you know. Now we want to know dividend payout ratio. How do you get dividend payout ratio? Dividend per share divided by earnings per share. Correct? Okay, now if this dividend is on 2026 platform, earnings also should be on 2026. But in the question they gave earnings for 2024 and 2025. Getting it? So, but we need 2026 ka earnings. But they gave one clue. What is that? 1 lakh became 1,04,000. That means growth rate is 4%. So next year earnings will be how much? 1,04,000 plus 4%. Agreed. First find that. Profit for 2026 will be 1,04,000 plus 4%, which is 1,08,160. All of you got this? This is what? Total earnings. This is the total earning. Sir, how do you get dividend payout ratio? Dividend per share divided by earnings per share. Is this per share or total shares? Total earnings. Do you know the total number of equity shares? Yeah, given. So first line only they gave number of shares how much? 10,000. So what is the earnings per share? 1,08,160 is for 10,000 shares. For one share, it will be 10.816. This is for which year earnings? This is for 2026. The dividend is also on 2026 platform. Earnings is also on 2026 platform. Any problem or so far good? Now can we find dividend payout ratio? How? DPS divided by EPS. Do that. Dividend per share divided by earnings per share. Do that. How much are you getting? 60%. 60% or 0.6. That means what is retention ratio? 60% of earnings if you are distributing as dividend means how much you are retaining? 40%. So B is 40%. Got it? Once more, any problem till here or all the numbers are okay? Pakka? How do you get G? B multiplied by R. Growth rate is given to be 4%. B just now we got it to be 40%. So how much is R, people? 0.04 divided by 0.4 will be 0.1 or 10%. Clear? Everybody good? Sometimes in MCQ you need to be a little smart. Okay. Sir, in this MCQ, they ask one requirement or two requirements? Two requirement. One is face value, another one is R. R we already got. How much? 10%. Now people, first option is face value, second option is R. Is first option the right? A is the right answer. No, R is 10%. Which has 10%? Either the answer will be B or it will be D. Sometimes what happens is only one option will have 10%. Only one option will have 10%. So second one should we have to solve or directly select the answer? Directly select the answer and move on. Sometimes ICA it does that. So when one requirement is done, automatically look for the option. If that is the right option means select it off. No need to even bother about the next requirement. Here there are two R's with 10%. So option will be either D or it will be B. Now I think I have to solve the face value. Can we try the face value? No question till here, no? All good? This is also very simple. R is how much? 10%. R is 10%. Now people, first year, equity shares, did you raise it in 2026 or 2024 only? 2024, how much is the profit? 1 lakh. Use your common sense. Profit you will earn on your capital. No? Profit you will earn on your capital. How much return are you, how much profit or return are you generating? 10%. And how much is it in amount? 1 lakh. That means your capital has to be 10 lakh. Do you agree? Because 10 lakh ka 10% if you do, then only you will get 1 lakh. 10 lakh ka 10% if you do, then only you will get 1 lakh. Agreed? Or use return on equity ka formula. What is return on equity ka formula? Each divided by equity. Each divided by equity. Or maybe I'll write it over here. Return on equity is equal to each divided by equity. Now, what is return on equity? R. That is 10%. 0.1. Divided by each, which is how much? 1 lakh. Divided by equity. Therefore, equity will be how much, people? Therefore, equity will be how much? 1 lakh divided by 0.1, which is how much? 10 lakh. Should you have to really solve this or directly you can check? 10 lakh ka 10% only. 10 lakh ka 10% only can give you 1 lakh. No. So automatically capital is how much? 10 lakh rupees. Agreed, everybody? Now face value is very easy. Equity share capital how much? 10 lakh. What is the number of equity shares? 10,000. So that means what is the face value of one share? 10 lakh is a total equity share capital. We have 10,000 shares means how much is the face value? 10 lakh divided by 10,000. How much is that? 100 rupees. That's what I put up here. That means what is the right answer? Which has face value 100? B. That means B for Bengaluru is the right answer for this particular option. Okay, na Sarji? Clear. Move on to the next. Careful about the dates in this problem. All this quickly I'm solving. After, if you want later on, you can revisit this and watch. Okay, we'll upload this on YouTube as well. So you can refer this. Now check. What is the market price of the share in the year 2025? Dates are important. As per what? Walter. People tell me Walter Sir's ka what is the formula?
D plus R into E minus
P naught is equal to D plus R into E minus D divided by cost of equity. Whole thing divided by cost of equity. Yes, sir. Right, everybody? Now don't be in a Josh and do off. Sir, D we already know, sir. D is 6.49. E we already know, sir. R we already know, sir. K given, sir. Taka tak madbidana, sir. D is 2026. E is 2026. They asked the price of the share for 2025. This is not growth rate. This is not Gordon Chachaka normal. That means we need all the data on which year? 2025. Yes, we do have DE and all, but we have it for 2026. But we need it for 2025. How to find? Sir, if they have given you 2025 ka growth rate, if you know 2025 ka dividend, let's say that is 10 rupees, what will be 2026 ka dividend? 10 plus 4%, which will be 10.4. Yes, no. Now you have to do backward calculation. That's all. You know future value. Now we need to find present value. You have value after 1 year. You have value after 1 year. You have the value of for which? You have the value for which year? You have the value for 2026, but we need it for 2025. So we have a future value. We need a present value. How to find, people? How do you find present value? Future value into multiplied by discount factor. No. So simply just do that. What is it here? Growth rate is a discount factor. How much is it? 4%. Calculate. This is the future value and discount factor is 4%. Take this number and you do 1 divided by 1.04. How much is that? 1 divided by 1.04. How much is that number, people? See, check, I've done here. If you want, check the screen if you want here. Dividend for 2026 is 6.49. Correct? Till here all of you good? What is the growth rate? 4%. That means we need dividend for 2026 or 2025. So this becomes future value. This becomes discount factor. How do you find present value? Future value multiplied by discount factor. Yes, that's how we find future value. No, NPV problems. Future value multiplied by discount factor. This is your future value. Discount factor is 1 divided by 1.04. Multiply and you'll get 6 point how much? 6.24. Good or got it? Everybody sorted? And now we got now dividend for 2025. Similarly, we need EPS also for 2025. We have 2025 or 2026 ka. We have for 2026. How much is 2026 ka? 10.816. Same calculation. Find out EPS for 2025. Tell me. Same growth rate. 10.816. So into 1.04. How much, people? 10.04. Okay. 1 minute. Are we good with this so far? Everybody. Backward calculations. Okay, now Walter's model D plus R. Now plug in. Dividend do we have? How much is the dividend? 6.24 plus R you already know 10% divided by K. K is given to be 8% into E minus D. E is 10.04. Dividend is 6.24. Divide and you'll plug in and you'll get the particular number. Okay, na Sarji? Yes, sir. What is it?
Sir, they have already given 2025 earnings.
They've already given 2025 ka? Okay. Another approach is also okay. That way also you can do it. Possible. But understood, everybody. Overall good. Pakka na, got it. What is it? That means what is the final answer you're getting? 143 we got. So the answer is C for Chennai. Next question. Chudama. R is how much? 10%. R is greater than cost of equity. Now they're talking about optimum dividend. We know Walter as well as Gordon. If R is greater than cost of equity, optimum dividend payout ratio is 0. Which option has 0? 0. Sir, now here check smart. Here 60. 60 is right answer. 40 is right answer. 100 is right answer. Now which is the only option which has 0? 0. That means even should have to solve the other things or not even required. So C for Chennai, answer go on. Move on forward to the next. Next, what is capital employed at the beginning of 2026? They're asking capital employed at 2026 beginning. Growth rate you already know. How much is it? 4%. Estimated earnings for 2026. So three things they're asking: capital, growth rate, and earnings. They asked EPS or earnings. I think we already found no. What is earning? Here only we wrote 2026 earnings we have. Somewhere we read here only. Where it went now? Here, what is the earnings for 2026? 108, 160. So again do a done now. Done. Which option has 10,000? 108, 160. Check. 108. Earnings is last number. Last number you should look for 108, 160. Which one has that? C. Only one option has that. So that means answer has to be C for Chennai here again. Clear? Earnings we already did. One if you figure out, means you already know the answer. You can move forward. Yes or no? Correct or no? Correct. Now what is the capital employed at the beginning of 2026? Then they're asking growth rate. Then they're asking earnings for 2026. If the company, sir, it looks like same question, but hang on. This question, read it if you want. They ask capital employed 2026, growth rate and earnings if company continues with what policy? Current dividend policy. Current, whatever currently they're paying. What is the current policy? 60% is a payout ratio, 40% is retention ratio. That is our current policy. If current one continues, what are these three data they have asked in question number 4. Read requirement number 5. Same thing. Capital employed, growth rate, estimated earnings. If company adopts optimum dividend payout ratio in 2025. Sir, they've given 1 year data, 2 year data. 2024, 2025. Okay. In 2024, may company followed optimum or only in 2025? Once more. What now? If you want, I'll write the data there. What is the dividend payout ratio, people? 60%. Okay. So what does the retention ratio be? 40%. Correct. Now, when did the company follow optimum dividend payout ratio? From 2024 or 2025? So from 2024, company continued this policy only company continued. Yes, sir. In 2025, what do you think is the optimum dividend payout ratio? We already know R is greater than cost of equity. When R is greater than cost of equity, dividend payout ratio should be 60% or 0%. And therefore, retention ratio should be 100%. This is what company is following. Correct? First year, May 2024, May they followed normal dividend policy. Optimum dividend policy company applied only in 2025. Easy. Understood this question now. Everybody good? And now they ask capital employed. Sir, how do you get capital employed? Equity share capital plus retained earnings, because we don't have debt here. We don't have preference shares. Equity share capital, you already know. How much? 10 lakh. Retained earnings. We have 1 year ka retained earnings or 2 years ka? 2 years. First, 2024. Check. How much did we earn? Check the question. 2024 mein how much did we earn? 1 lakh. Next year mein 1 lakh 4,000. Now make me happy. In 2004 mein company earns 1 lakh, means fully they will retain or 60% they will pay off. 60% they'll pay off. How much they'll retain? 40%. That means what is retained earnings ka balance? 1 lakh ka full or 40%? This is for which year? 2024. Correct? Huh? Now they ask the capital employed for 2024 or 2025. That means we have next year also profit. How much is next year profit? 1 lakh 4,000. Next year may company followed optimum. Optimum means they paid any dividend or no dividend. I mean 100% they retained. So that means this is 1 lakh 4,000 ka 100%. Calculate what is this? This is how much, people? This is 40,000 and this is 1 lakh 4,000. Therefore, what is capital employed? 11 lakh 44,000. Agreed. That's what I've put it in individually over here. Total answer is 11 lakh 44,000. What is this 11 lakh 44,000? Capital employed. Check which option has. For capital employed is the first number. Which first number has 11 lakh 44? Not this, not this, not this. This. So I mean, therefore, what is the answer? D for day. One if you have got it. Other one required or not required? Directly select the answer. That too a good question. Good framing, I could say. Because they have given 24, 25, sometimes they are asking 26, so again 24, or like this, they are jumping to and back and forth. That way, a good question this one is. Everybody got it? You want me to give you a summary of this question or manageable? Okay?
In that first MCQ, you found out equity rates. Sir, why can't we use each divided by KE for this?
Which one?
To find out equity.
Each divided by K, if you do, you will get market value of equity. S you will get. That is S, not that. Okay, so that will not work. Okay. Comfortable? Okay, so that means we'll move on to the next. Okay, next MCQ question is this. This is Faltu. Check. Current liability comprises of two things: bank credit and other liability. Maybe we have a short-term bank loan and some other liability. And they are in what ratio? 2:1. Current liability is 3 lakh. Oh, that means can you find out components of current liability? Components are in what ratio? 2:1. What is the total current liability? 3 lakh. Therefore, what is bank credit? Bank credit will be 3 lakh in 2:1 ratio. So 2/3. How much is this? 2 lakh. So what will be others? Balance 1 lakh. Fine. They ask current ratio is 2:1. Current ratio is 2:1. How do you get current ratio, people? Current assets divided by current liability. How much is that? 2. Current liability is given as 3 lakh. Therefore, what is current assets? Current asset is 2 times of current liability, which is how much? 6 lakh. Any problem? Then they give quick ratio 1:1. What is quick ratio ka formula? Current assets minus closing stock divided by current liability is 1. So current asset you know, current liability you know, can't you find out? Closing stock. Substitute current asset 6 lakh, current liability 3 lakh. When you solve, you'll get closing stock 3 lakh. Check what did they ask? They asked bank credit value and inventory value. What is bank credit value? 2 lakh. What is inventory value? 3 lakh. So 2 and 3. Option B, Bengaluru. This is very, very straightforward question. Nothing here. Move on to the next. Sir, capital gearing ratio. Capital gearing ratio ka formula, tell me. Capital gearing ratio means what? Using fixed cost instrument to increase shareholders' equity. So how do you get capital gearing ratio? Basically, fixed cost instrument in numerator. Preference share capital plus your long-term debt divided by equity or net worth. So, take your calculator. 12% debentures is 50 lakh. Preference share capital is 25 lakh. Term loan is 15 lakh. All these are fixed cost instrument. It will come in the numerator. Add 50 lakh, 25 lakh, 15 lakh. How much? 90 lakhs. Okay, fine. Equity share capital how much? 48 lakh. Reserves and surplus how much? 24 lakh. How do you get equity or net worth? Equity share capital plus reserves and surplus. Yes, no people? So in the numerator mein preference share capital plus debt to. Denominator mein equity. Equity means equity share capital plus reserves and surplus. Anything here or easy only? This is pretty straightforward. Yes or no? Okay, that's your capital gearing ratio ka MCQ. Can I move on to the next? Okay. Ratio question not there. We have a similar question. When I write NR, it means not required. We have a similar question already there. Cost of capital is a good question. I don't know, maybe this time when they constructed RTP, MTP, no, maybe they thought too much on the mathematics. They have given a lot of questions based on equations. Mathematics, simple mathematics they've used and constructed at least 4-5 questions we have seen. Okay, this is actually one such question. Check. Zebra Dynamics is a diversified engineering firm, is currently undergoing strategic review of capital financing. Fair enough. Board has strict, this is not MCQ, this is a descriptive question. MCQ is over. The board of directors have strict hurdles for new project. Chief Financial Officer has stated cost of capital based on book value weights. Book value weights, cost of capital means KO based on book value. How much? 11%. Cost, overall cost of capital, KO based on book value is 11%. While the cost of capital based on market value is 150 basis points higher. Sir, 100 basis points means 1%. 100 basis points means 1%. Normally you will see RBI raise the BEPS by, they'll say basis points. Okay, that's a common language. 150 basis points means how much percentage? If 100 basis point is 1% means 150 basis points will be 1.5%. So based on market value, KO is 1.5% higher or lower? What did they get? Is exactly 150 basis points higher. That means what is KO based on market value? If KO based on book value is 11 means KO based on market value will be 1.5% more. How much is that? 12.5. 100 basis points is 1%. So KO based on book value, based on market value is given. Need a minute or move on? Easy now so far? Okay, next. Some benchmarking data they have given. To determine the cost of equity, the finance team has gathered two comparable peers. To find out cost of equity, our competitor ka few data we have gathered. Our competitor name is A Limited, B Limited. A Limited beta 1.2, B ka is 0.8. Expected CAPM return. Sir, CAPM model, what's the formula? RF, cost of equity is equal to RF plus beta into RM minus R. Agreed? They only calculated that. A Limited ka cost of equity how much? 15.2. B Limited ka cost of equity how much? 12.8. This is ours. Now we are zebra. Not literally. In this question, we are zebra. This A and B is our competitor. Fine. Competitor company ka cost of equity we have gathered based on which model? CAPM. Keep that in mind. Now some book value terms they have given. Check. The company maintains traditional balance sheet with equal ratio of equity and debt. Sir, this is on what terms? Book value. They are saying book value, we have equal ratio of equity and debt. That means weightage of equity and debt is different or same? Me telling or question? So that means indirectly they're saying is what? Weight of debt is 0.5. Cost of, rather weight of equity is also 0.5. Yes, no people, because total weight is always 1. So that's what they gave you. This is based on what? Market value or book value? Based on book value, weight of equity and weight of debt, both is 0.5. Move on to the next. Now they have given market value. Read this again carefully. Due to the market optimism, company equity trades at a premium. Market value of equity is 3 times of book value. If book value is 100, market value will be 3 times, which is 300. Whereas debt will trade at par only. That means debt ka, what will be the debt ka market value? If you want, you can just write over here. Book value, equity, debt. If equity and debt ka book value different or same? That's what they said. Right? If book value of equity is 100 means market value will be 100 or 3 times more? 3 times more. So equity ka market value will be 100. What about debt ka market value? That is also premium or at par it will trade? That means debt ka market value is how much? 100. Agreed. That means you tell me what is the weight? As per book value, the weightage is 0.5 and 0.5. Here it will be what? 3:1. 3:1. Correct? 300 is to 100 means 3:1. 3 divided by 4 is what? 0.75. And the other one is 0.75 and 0.25. Agreed, people. Weightage in market value terms, weight of equity is 0.75. Weightage of debt is 0.25. Because the ratio will be in the, it will be in the ratio of 3:1. I'll give you a minute. If you have any doubt, ask. All okay? Numbers are looking fine for everybody? Pakka? Yes, Aji? And now, people. They've given some more data. Again, when the question is lengthy, always have a quick review of the requirement. They asked breakdown of component cost. Sir, here we have two components. What are those? Equity, debt. Both ka cost they are asking. That means they are asking cost of equity and cost of debt. And they have given KO. They have given KO. That is a clue. Simple formula. Sir, KO ka one-liner formula, tell me what is it? Either you can put that table or you can take what? Cost of debt into weight of debt plus cost of equity into weight of equity. Fine. And this KO they have worked once or twice? Once based on book value, once based on market value. So KO is given, weights are given. That means you need to you'll get 2 equations. Substitute and get cost of equity and cost of debt. Mathematics. That's all. 2 times. This is the equation based on book value. Same equation you'll get KO based on market value. Only component missing will be KD will be missing. Cost of equity will be missing. One you need to substitute and get the answer. It's pure maths. Nothing to do there. Okay, like this you have 3-4 questions in this RTP MTP. They have constructed like this only. I've solved. Can we review? Everybody understood what is the structuring here? Okay, now look at the requirement. First, KO as per book value. KO as per book value. What is KO ka simple formula? Weight of debt into cost of debt. Weight of equity into cost of equity is equal to KO. First, what is the KO as per book value? What is the answer they gave? As per book value, the KO is 11. And as per market value, it is 12.5. So we are doing book value first. KO is 11%. Sir, in book value terms, equity and debt ka weightage different or same? Same. Just now they told. What is the weightage of debt then? 0.5. What is the weightage of equity? 0.5. KD we know or cost of equity we know? We don't know. So that is as it is. Now substitute. One you substitute. Either you try to calculate KD or you try to calculate KE. Now if you want to find KE, tell me, how do you solve this? Send this to the other side. So it will be what? 11 minus 0.5 KD. This is 0.5 times of KE. So this 0.5 you will send it to the denominator. It will become what? This will be the equation. Any problem in this? Once more or got it? Pakka na? If you want me to write it once again, if you want to write, I will write it like here. 0.5 KD. 0.5 KD plus 0.5 cost of equity is equal to 11. I will keep it in percentage. Therefore, what will be? 0.5 cost of equity will be 11 minus 0.5 times of KD. Therefore, cost of equity will be what? 11 minus 0.5 KD divided by 0.5. That is what directly I have written in one liner. Manageable. So now cost of equity I have expressed in what terminology? Cost of debt wala terminology. I have expressed that. Okay, we have one equation, we have one more equation. We have only this equation or one more equation. What is one more equation? This is based on book value. We can construct one more equation based on market value. Or 1 minute. Observe if you have any doubt in this. This is okay, no? Pakka everybody? Balcony. Okay. Now next, you guide me, let's see. Same KO. Now you will find based on market value. And market value weights missing a given. We already found out here. Market value of equity is 3 times higher than book value. But debt ka value is 3 times higher or same. That means what is the weight of equity and debt? 300 is to 100 or 3 is to 1. So if you do that, it will be 0.75 is to 0.25. Correct. And this is the weightage of equity and debt. And do you know KO as per market value? Yeah. KO as per market value is 150 basis points higher. So that means what is KO as per market value? 12.5. So find another equation again. Same KO as per market value. What will be the equity and debt ka ratio? 3 is to 1. So therefore, same equation. KO ka we already know based on market value 12.5. Construct. This is your way to get KO. What is the weightage of debt here, people here? 0.25. Cost of debt you know or don't know? Don't know. Weight of equity? 0.75. Cost of equity know or don't know? Is equal to KO 12.5. Solve as much as possible, solve, then substitute. This is 0.25 KD. Instead of cost of equity now, instead of cost of equity, I will substitute. What is cost of equity? 11%, or you can just write 11. 11 minus 0.5 KD divided by 0.5. Wherever K is there, here instead of K, I'll substitute. What I'll substitute with? This particular number. 11. 11% is 0.11. Minus 0.5 KD divided by 0.5. Understood? Everybody good? Now solve this equation and you will get KD as 8%. Pure mathematics. 2 equation is there. One you'll have to get on as express on the other, solve and get the answer. I've solved it. In case you need some more time to review, you can review. Or got it? No problem, no? Sir, if you know cost of debt, can't we find out cost of equity? Cost of equity is 11% minus 0.5 times cost of debt divided by 0.5. So solve now. Therefore, what is cost of equity? 11% minus 0.5 KD divided by 0.5. Solve this. If you take this in decimal, final answer also will be in decimal. If you take percentage, final answer will be in percentage. Your call. So cost of equity will be how much? 14%. That's it. Someone has used their kidney too much here. Mathematics kidney too much they've used. Okay. No, the FM concept, nothing. It's become pure maths stuff. Moana. So that is the first requirement of the question. Breakdown of components ka cost. Component cost means KD and cost of equity. Found. Can we read the second requirement? Now read the second requirement. Calculate corporate tax rate. Again mathematics. Calculate corporate tax rate applicable to the company, assuming that this line is important, assuming discount on issue or premium on redemption are also tax deductible. I discussed this on day 1. Let's see who remembers it, who tells me this particular line. Or maybe I'll read you one more data. We've not read this data. I'll read this. Debt capital is raised entirely through debentures. What is the interest rate on debenture? Coupon rate means interest rate. What is the interest rate? 7%. These debentures were issued at a discount of 100. For how much value? 90. So issue price we know 90. Debentures are redeemable at par. Par value is 100. What is the tenure of the debenture? 4. I mean, this is irredeemable debt or redeemable? Redeemable. So redeemable debt ka what is the formula? Interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by. Okay, now everybody, the 2 check points you need to be careful over here. Cost of debt missing or already got? Just now we worked no much, 8%. KD we know. KD we know. Okay, interest they've only given. Face value is 100. 100 interest is calculated on face value. Face value is 100. Interest rate is 7 means interest also you know. Tax rate not given. We have to find. RV redemption is happening at par value given. Net proceeds, issue price, flotation cost not there. Flotation cost not there. N given to be 4. So means every data in this particular formula is given except T. Solve to get T. That's what they are asking. Yes, sir. That's the first part of the problem. Everyone good with this so far? Now read this line once again and tell me what is a hidden adjustment. Calculate corporate tax rate assuming discount on issue or premium on redemption are also tax deductible. Perfect. Perfect. Sir, we do 1 minus tax rate next to interest. Why? Next to interest, we do 1 minus tax rate. Why? Because we get tax benefit. We get tax benefit. Now, tax benefit you will only get on this or also on this? Also on this. That means here the formula is not this. You also have to multiply 1 minus tax rate to this. That's all as a hidden adjustment. Okay, now everybody. Because they told in the problem, this portion also is a tax deductible or you'll get tax benefit on this. That's your formula. Every component given except T. Solve and get it. I've just solved it for you here. Check. KD is equal to interest into 1 minus tax rate plus RV minus NP divided by N into 1 minus tax rate. Whole thing. KD we already found. KD is how much? 8%. Interest is calculated on face value. Face value is 100. Interest rate is 7%. 100 ka 7% how much? 7. 1 minus tax rate. Tax rate don't know. RV is how much? 100. NP we issued at a discount of 90. They only told. Divided by N what? Tenure. Life how much? 4 years. Into 1 minus tax rate, don't know. Divided by RV plus NP by 2. Solve this equation. Finally, you'll have solved as much as possible. Right? So finally, you'll get T to be 0.2 or 20%. You want me to take you through this solving or okay na? Manageable, no? So finally, T will be what? 0.2 or 20%. Again, proper kidney. Okay, but they brought in this also. That was good. Till now, this adjustment was not tested. This portion was never tax deductible. There was a formula in ICI material which we had discussed. I think we discussed in class also about this. But it was not applied. Now it came as a new fitting. That's a good takeaway of this particular question. Need a minute to review or can I move forward to the next? Okay. Third requirement. One more we have here. Calculate beta of the company. Sir, beta of the company is this, sir. Eh? No. This is the beta of our competitor. Now they are asking we are zebra. Our company ka beta they are asking. Which formula uses beta? CAPM. Tell me CAPM ka formula. RF plus beta into RM minus RF. RM not given. RF not given. Beta also not given. How to find? Correct? No. Where is RM? Where is RM? Not given. Where is RF? Not given. Where is zebra ka beta? That's what we need to find. But cost of equity of zebra we already know. We found in first line. Tell me once again, correct only. What you told is right only. What did you say? Equation. Once more, give me. They've given competitor ka, no. Competitor ka. One they've given or two competitor ka. Like there it was book value, market value. We had two equation. Here competitor ka CAPM model you use, you'll get two equation. Substitute and get RM and RF. Substitute and get RM and RF. Market rate, will it be applicable for company or every company? RM is also applicable for one company or a common number? Common number. So you have to again get two equation from this competitor data. Solve that, get RM, RF, substitute and then get beta of zebra. Pure maths, nothing in the FM over here. Okay, now okay, just check. What is CAPM model ka formula? RF plus beta into RM minus RF. First, they have given cost of equity of A Limited. They've given cost of equity of A Limited. How much is that, pa? 15.2. Beta of A Limited, do you know na? 1.2. Cost of equity is 15.2. RF you don't know. Beta is given. Beta is how much? 1.2. RM minus RF you don't know. So solve as much as possible. Solve. You will get this. You will get this. Now either you will substitute for RM or you will substitute for RF. Your choice. I have substituted it for RF. So how do you get RF here in this equation? How do you get RF? Send this to the other side. So it will become what? 15.2 minus 1.2 RM. Correct, no people? Or maybe I think this is, okay. RF, send it to the other side, or this is negative, no? So this comes to the other side. Send this to the other side. So it will be 1.2 RM minus 15.2. Whole thing divided by 0.2. Clear, Aji? Pure equation substitute. Need a minute to review this, or you can solve this equation. Like this, we have one equation, or even B limited ka. B limited ka equation also we have. Cost of equity of B limited is given to be 12.8. Beta of B limited they have given, but RM, RF not given. Solve, and once you get a particular number, substitute. Wherever here RF is there, no, instead of RF, what I'll write? 1.2 RM minus 15.2 divided by 0.2. Substitute. And when you solve, you'll finally get RM to be 14%. Through RM, you'll be able to get RF to be 8%. Pure substitution equation solving, nothing else. If you need some more time, I'll wait. Or if you think, no, overall we got it, fine. Got it. RM over, RF over. Cost of equity of Zebra also, you know. That means only thing missing is what now? Beta. No, you will get it. Okay, cost of equity of Zebra is RF plus beta into RM minus RF. Cost of equity of Zebra we already found here first only. How much is that? 14%. So this you already know. 14%. RF we just now got it to be 8%. Beta of Zebra we don't know. That's what we need to solve. RM we know. RM is 14%. So solve and you'll get the beta to be 1. That's the thing. That's about this question. A good question according to me. Okay. Totally new. It was not there at all. Okay. And that way good. Again, these are easy questions, but do watch out for the time. Maximum it will be like 8 or 10 marks question. So 15 to 20 minutes tops. Maximum 25 minutes. Now beyond that, danger zone. Okay, but you know, now you know, no, these sort of questions also can be constructed. Now you can solve it faster. They did not ask this directly in the paper. First they have given it in RTP. So at least once we can practice. So we can be aware that these sort of question also can be constructed. And if it comes in future, we can manage them. Even if you can't solve fully due to lack of time, at least half if you solve also, you will get 5%. Out of 10, you will get 5 to 6 marks. Full you can solve, but you might take a little extra time. So watch out for that. And don't keep people here I've solved, no, don't solve every line. Every line solving is not required, okay? Just substitute to the extent possible, and if you can directly get in your calculator, do it. No need to show each step in exam, solving step. I have shown because some of them may not get it. Because not everybody is mathematics students and they may need some help. So as much as possible, as detailed, I have called out. In exam, to the extent you feel is required, you do. If you are able to directly jump to the final answer, stop at that step and jump to the final answer. Each step showing not required. I mean solving. And now according to me, this question is over. What about you? Now what, macha? Picture it, How you will take picture it, This, Whole thing you want, No? Okay, take at least 2-3 pics then. Fine. Okay, next. This one, approach. Same question is there over here. So we don't have to do this. It's a repeat question. Leverage, one good question. Again, some kidney they've used. We will see what we can learn from this particular question. Leverage wala, question number 7. Careful. 1 or 2 datas, I think there is some easy only. But 1 or 2 datas we can interpret wrongly and kind of it can change the direction of the answer. ABC manufacturing company produces industrial components and when well-established company operates under special tax-free status. Tax-free status. That means for this company tax is there or tax is nil. You know later what they'll say. Tax rate is 20%. That is the general market ka tax rate. But this company has tax rate or tax-free status. So that means for this company applicable tax rate is 0. That's it. Okay, and it exempts from income tax obligation. Fair enough. They've given some data for the current fiscal year, current year. Capital invested, how much? 20 lakh. Capital does not mean share capital. Capital in FM means long-term source of finance. Equity, debt, preference share capital put together. How much? 20 lakh. Cost of equity, 12. Cost of debt, 6%. And then they give WACC. That means company has only two sources of finance, equity and debt. Cost of equity, cost of debt given. WACC is also given. That means what do you think drama is here going to be? Weights. Last time they had given weights, so and they asked us to find out cost of equity and cost of debt too. Here they have given cost too and asking us to find weights. So same sir, equation sir. Don't know, we'll see. Now annual sales how much? 24 lakhs. Variable cost is 50% of revenue or sales. Fixed cost is 10 lakh per annum. General corporate tax rate is 25%. Relevant for us or not relevant? Because we enjoy a tax-free status. For us, the tax is 0. This is just given to confuse. If you take this number, whole answer will change. So this is not relevant. So I've written it out there for you. Now requirement, they're asking optimal debt equity composition. Optimal debt equity composition so that weighted average cost of capital is how much? 9%. That's what they told here. No, WACC or KO is how much? Optimal equity debt composition under what are they asking? They are asking debt ka and equity ka amount. Total capital is how much? 10 lakh. In this 10 lakh, how much is a debt to how much is equity? Basically, they are asking weights only, people. They are asking weight of debt and weight of equity. That's what they are asking. Cost, in this problem, weights is missing. But we have two equation or only one? No. Here on where? Two only. Only one KO given. No. They have not given two. They have only given one overall cost of capital. But still we can solve. And now leave this requirement. Tell me, or maybe first maybe in this problem interest, I'll just put up the table. Remember your cost of capital ka overall cost of capital we used to solve under table approach. What is that table? Source. So maybe we'll okay. So after source, we used to write the market value or book value. Okay, let's assume book value here, and then weights. So after tax cost of capital, and then you used to get KO. Fine. In the source column, we used to write equity debt. Done now. Now, do you know cost of equity? Yeah, cost of equity given how much? 12. Cost of debt 6%. So this is 12 and 6 given. Weights given are missing. Total we already know is 20 lakh. Equity and debt put together is 20 lakh. What is the weightage? We don't know. But one thing we know is total weight will always sum up to 1. That we know. If you know, if this clicks, problem solved. Tell me how. X. If weight of equity, if you assume it as X, or since here we have to multiply, whenever multiplication comes, I don't like to assume X because I don't like my X. Yeah, so whenever this comes, I'll assume it as a different variable. What happened? A, B, something is good. Because you have to multiply, no? When I write X into X, so it will be like, you will not know what is variable, what is multiplication, will be confusion. So hence, I would like to assume another variable, which is what? A or B. Let the weight of equity be A. Let the weight of equity be A. Therefore, what will be the weight of debt? Total weight we already know is 1. So this will be 1 minus A. Correct? So how do you find KO? Alignment error. And this is 12 low, this is 6. So how do you find KO? These two ka multiplication, 12. These two ka multiplication. The total should be equal to 9%. Solve the equation. Because these two ka addition only is 9%. No? Solve the equation and you get the answer. That wala problem. Pure again, this is a match wala question. Nothing to do with your any of your FM concepts. Understood? So now see how we have put forth here. See if it makes sense. They are asking optimal debt equity ratio. I've assumed let the weight of the debt be A. Weight of the debt, let it be A. That means weight of equity will be 1 minus A. How do you find KO? Without table, one-liner formula for KO is what, people? Weight of debt into cost of debt. Weight of equity into cost of equity. KO, they only given in the question 9%. Weight of debt, I've assumed it to be A. Cost of debt is 6% given. What will be the weight of equity? 1 minus A into 12. Solve and you will get the A to be how much? 0.5. What is A we have assumed? Weight of debt. Sorry, weight of debt is 0.5 means weight of equity is also 1 minus A, which is 0.5. That means what is the combination? Different or same? Total capital how much? 20 lakh. And weightage is same means equity ka value 10 lakh. Debt ka value also 10 lakh. That's the first requirement. That's all. Wait. 50-50%. The weightage is 50% equity, 50% debt. Any problem in this? I wrote, he's like, you did mistake. Da, correct, da, he's saying. Okay, Macha, thanks. He's saying I should have written 20 lakhs. Thanks, Macha. 20 lakh ka 0.5 is 10 lakh. Correct. Sorted, ah? Okay. Next, I think, next requirement, this is faltu now. Check. Prepare a comprehensive income statement. They have given sales. From sales, we'll have to arrive at income statement to showing profitability from operations through net income. I mean, they're asking us to go up till net income. Net income means PAT. Or EASH actually. EASH we call it as net income. But anyway, preference dividend is not there. So PAT only will become EASH. When three circumstances. One Allah. When cost of debt is 6, 10 and 12. When cost of debt is 6 or 10 or 12. This is easy, no? Anyway, tax rate is not there. So, cost of debt, you can say cost of debt is 6% or you can say interest rate is 6%. Tax is not there, no? So, interest, basically they are saying interest rate in first case is 6%, second case 12%, third case 6 or 10 or 12. Okay, check the things. Do you know sales are how much? 24 lakh. That means one case we'll have to solve or three case. When cost of debt is 6, 10 and 12. Sales given 24 lakh. Variable cost, I think they told us 50% of sales. No, variable cost is 50% of sales. Sales minus variable cost will give you what? Contribution. Fixed cost, they have only given in the question to be 10 lakh. From contribution, if you reduce FOC, what are you going to get? EBIT. Correct? And now interest. This changes. Check. In first case, what is the interest rate? 6%. How much is your total capital? Total capital 20 lakh. Debt is 10 lakh. Equity is 10 lakh. Debt is 10 lakh. Interest rate on debt is 6%. How much will be interest? 10 lakh ka 6%, which is 60,000. First case. Second case, interest rate they are telling 10%. 10 lakh debt to interest rate 10%. 10 lakh ka 10% how much? 1 lakh. Third case, interest is 12%. So 10 lakh ka 12%. 120. So EBIT minus interest if you do, you will get earnings before tax. Tax rate is not there. E2, issue, net income, everything will be same. Clear, people? That is what they asked in second requirement. This is over. This is faltu, I think. Pretty straightforward. Can we read the third requirement? Yes, sir. Okay. Next to calculate ROI. ROI. And here they have also asked ROE. So return on investment either can be rows or row. Right? It can be ROA also, but asset information not given. There are three return on investment, no? Rows, ROA. Yeah. Asset information not given. So we can only calculate rows and ROE. Now for this, you want to create one more table. No, that means here only we'll calculate. Now how do you get rows, people? EBIT by capital employed into 100. So EBIT is here. Capital employed 20 lakhs. That they have given. Calculate rows. How do you get return on equity? You will take EBIT or you will take EASH. Here EBT, EAT, EASH. Everything is same. Divided by equity. What is equity ka value? 10 lakh. Calculate over. This is faltu. This is the third requirement and fourth requirement. Yes, Naja. So second, third, fourth requirement, I've done it in one table. So far good, everybody? Okay, next, they did not stop there. Looks like Hanumantan Bala going on. Fifth one, now they ask leverage. What? Leverage. Sir, business risk, which leverage? Financial risk, combined. They could have said OL, FLCL. No? And now they're saying computation. You have to present leverage in this way. In this table format. What computation you already know. What is operating leverage ka formula? Contribution by EBIT. Financial leverage? EBIT by EBT. It's OLS or CLS, OL into FL. This is dependent on they're asking. OL is dependent on what? Leverage is a fixed cost study, no? We have two fixed costs. Fixed operating cost and fixed financial cost. OL concentrate on fixed financial cost or fixed operating cost. So this is what? This is dependent on FOC. Financial leverage is dependent on financial leverage is dependent on fixed operating cost or fixed financial cost. This is financial cost. Combined leverage is dependent on both. That is your dependency. Now they are asking the effect to. This leverage measures effect on what and what? We already know. Financial operating leverage measures the relationship between sales and EBIT. How sales affect your EBIT? Financial leverage measures the relationship between EBIT and EPS. This one, sales. Falta. Chumma one, they're trying to make a mountain out of a molehill. Very straightforward this is. That's what I've written here. Okay, now. The question did not end there, pa. But very, very doubtful that leverage and all will be asked so much. Because leverage is a 5-marker topic. For 5 marks, this much and all they'll ask. Huh? If at all this much they ask means they have to give at least 8 marker. But anyway, RTP, so I'll not question. No? Sir, you already know, favorable financial leverage. You already have calculated. What is that? Now read this only if you want. If ROI is greater than the interest rate, what do we call it as? If return is greater than the cost of debt, it's a favorable financial leverage. If it is equal means neutral. If it is lesser means unfavorable. They have given equation. You just need to add one word. Favorable, unfavorable, neutral. That's what they are asking. Theory. Now next page they asked again you calculate ROE, return. Return we already calculated. No, that is over. Leave that. We already took that. Fine. We are already bored of leverage now. This question. Yeah. So that much they have asked. But overall, I feel this is easy only still. Just that they have asked too many requirements. So, but pretty okay, manageable wala question. And this problem, according to me, over. You need some review or no? It's like enough. Yeah. Done. Okay, this is over. Next. This is also a good question according to me on investment decision. Investment decision, I think they've added easy but good framing again. Okay. Yeah. So let's see what we can learn from this particular question. Equip Lease of Financial Services is a specialized equipment leasing company. So what do we do is we buy the asset and we give it on lease. That's how we operate, or that's our main line of business. We have been operating since 15 years. Awesome, good for us. The business model always involves purchasing high machinery and leasing. We know, no. Lease means that only. No, you purchase and lease. Company has built strong reputation. Come to main thing, pa. You purchase the asset for how much value? 10 lakh. And amount is paid upfront at year 0. Useful life 4 years. Salvage value nil, because they're saying technology becomes absolute. We can't sell the asset for anything. Depreciation. This is good. Check. Depreciation for tax purpose. We know that in investment decision we have to take depre based on income tax, not as per accounts. So they've given depreciation can be claimed by Equip Lease. Equip Lease is us. That's our company. Under either straight line method or under units of production method, UOP. Income Tax Act is allowing us either to follow SLM method or UOP, units of production. Units of production means using machinery will produce the goods. No, in that ratio you can calculate and claim depreciation if you know that particular production details. Fine. Now lease rental earned by the company is subject to tax. 1 second everybody, I just want you to clarify one information for me. Depreciation for the company is what? An expense or income? For the company, we have purchased the asset. So depreciation is an expense or income? Obviously expense. What expense? Non-cash expense. But yeah, have a little clarity on this. This is expense. Lease rental. Lease rental is an expense or income? Sir, we are leasing the asset. That means we will pay the lease rent or get it. That means lease rental is a income. Yes, sir. Now, why did I write this is on expense, due to expense, your profit will reduce and your tax also will reduce. I mean, on expense, you will get tax benefits. On expense, you will get tax benefit. On income, you will get tax benefits or pay tax. On income, you'll have to pay tax. Are we comfortable with this? I'll use this information a little later on. I'll come back to that. This is okay, no? Now, what is the tax rate? 25%. Fair enough. Tech manufacturing industry. So, this is probably the company whom we want to lease it out to. We are equip lease. Now, maybe we'll buy the asset and lease it to this tech manufacturing industry. So, they are growing precision engineering. They have approached us and they have shown interest in leasing. And they have given certain data. Check. The machine's usage follows graduated ramp-up pattern based on the tech's order book flow projection. Production capacity they have given. Now we will lease this machinery to them. Now using that machinery, they will produce the goods. First year, they're saying we'll produce low, then medium, then high, and then peak. As the number of years grow, production will reduce or go on increasing. First year we produce how many units? 1, next 2, next 3, next 4. That means what is the production ratio? 1 is to 2 is to 3 is to 4. Why do I need this? As per income tax, we, the leasing company, we can claim depreciation on straight line method or based on units of production. Units of production is in what ratio? 1, 2, 3, 4. So we can claim depreciation. Why 10 lakh I've said? What is this 10 lakh? You purchase the asset for what value? 10 lakh. What is the salvage value? 0. So 10 lakh you can either depreciate equally in straight line method or 10 lakh you will depreciate in production ratio 1 is to 2 is to 3 is to 4 and claim it. Both options are available to us. Correct. That's what depreciation I've called out here. Move on to the next now. This pattern is typical for business scaling up production with the new equipment. Okay, fine. They're saying that pattern is justifiable. This is what they say. We don't need that. We just needed the pattern. Okay. Clients want the company to charge a lease rental based on the client's utilization pattern of 1 is to 2 is to 3 is to 4. Now we are leasing company. We will lease the asset at free of cost or collect lease rental. Collect lease rental. Our customer is saying don't charge same rent. Don't charge same rent. You charge lease rental based on this production pattern. Production pattern is what? 1, 2, 3, 4. That's what client is requesting us. Don't charge same rent every year. Charge based on the usage pattern, which is 1 is to 2 is to 3 is to 4. Now, Vikram Malhotra, Chief Credit Officer of Equipment Lease, is tasked with the structuring appropriate lease agreement. This some officer, he has to make a lease agreement. He faces several strategic decisions. That means you have to help him in all this decision. He's cracking his head for this. Help him out. First, check how much portion of the cost is recovered. Carefully read. How much portion of the cost? Stop. Cost for us is, we are leasing company. First, we have to buy the asset. How much did we buy the asset for? 10 lakh. Okay. How much percentage of the, how much portion rather is of the cost is recovered from tax saving on depreciation under both the methods. What are the both the methods? SLM, units of production. Understood? Everybody, what they're trying to say. Now people, how much did we invest? 10 lakh. When did we invest? At year 0, we invested 10 lakh. Now depreciate. See, we have purchased the asset means we will only claim depreciation. We have not sold the asset. We have given the asset on lease. That means we will claim depreciation. Correct? No. Now, who will book depreciation? The client or us? Because asset is ours. Now, excuse me. Depreciation for us is an expense. Just now we said on expense you will get tax benefit. On expense you will get tax benefit. That means people, this is a cost, no? 10 lakh is a cost. Due to depreciation, I am getting some benefits. Yes, everybody. So that is what they are asking. How much is the total benefits you have already got in the form of depreciation? That is very easy, no sir. Depreciation, if it is straight line method, means 10 lakh is the original cost, salvage value is 0, divided by life is 4 years. So depreciation is 2.5 lakh every year. No much. On depreciation, this is an expense. On depreciation, you get what? Tax benefit. So what is the tax rate? 25%. You'll get a benefit of 2.5 lakh or 2.5 lakh 25%. 2.5 lakh 25%. How much is that? 60 to 500. Yes, sir. Sir, benefit is 60 to 500, sir, for 1 year, sir, for 4 years. Multiply, sir. Nah, wait. Why? Sir, depreciation, you will get it immediately, or end of year. So, first year, at the end of year 1, you will get benefit of 60 to 500. Second year, again, you will get a benefit of 60 to 500 due to depreciation. Third year, again, due to depreciation, you will get a benefit of 60 to 500. Fourth year also, how much? 60 to 500. Okay, na? I mean, this benefit is on present value platform or future value? This cost you incurred in future value or present? Present. That means what you have to do? This is the benefit expressed in future value terminology. Find out the present value. That's what we used to do in NP, we know. Take the future cash flow and multiply discount factor. Okay, everybody? So, understood? So, this is your future cash flow. Multiply by the discount factor and you will get the present value of benefit. That much you have already recovered because of depreciation. Out of this 10 lakh, this much present value you have already recovered. Balance we have to recover from lease rent. Goinda, got it. Akka. That is what they are asking. Easy question. Don't worry. But yeah, when you first time when you interpret it, it will be like, what are they asking? At least you are getting the question. Solution I'll show. I've just written in short format. How to present it, I've presented. I'll show it to you. Pakka, everybody got it? Yes. And now I am having a little buku. You give a recap for me. Just tell me what you understood. No? It can be a team effort also. I don't mind. Chorus beda. One stop, other can pick it up. Depreciation. No? She said depreciation, that's my thing. Then she's like, pass. Now, depreciation is a expense. On that, due to expense, tax will reduce. I mean, that is a benefit. Okay. So, that is what they're asking. How much portion of the cost is recovered from tax saving due to depreciation? Okay. But the problem is depreciation, you will get it immediately or end of every year. Means depreciation benefit you will get, no doubt. But you will not get it immediately. You will get it at the end of respective years. How many years we are planning to lease it out? 4 years. Means depreciation benefit you will get over a period of 4 years. So this is on future value platform. So now we have to get this on a present value platform. That is a total benefit we have got due to depreciation on present value terms. Meaning that much. Suppose this comes to, let's say, I don't know, we have to multiply present value and get it. Suppose after multiplying present value, after multiplying all the discount factor, let's say you got the value to be 1,20,000. Assumption. 1 lakh, how much? 20,000. That means, people, how much did we invest to buy the asset? 10 lakh. When? Now. How much benefit I have already got due to depre? 1,20,000. Now, means balance, how much? Balance is 8,80,000. That if I recover through lease rental, I think I'm happy. My investment is fully recovered. Understood? Obviously, I would want to recover more because I don't run the business at charity, right? I want to make more profit also on this. But when I talk about investment recovery, out of 10 lakh, in my example, 120 is already recovered. In what format? Depreciation ka tax saving format. Balance, if you recover through lease rental, I think it will be no profit, no loss for me. That wala case. Yes, Saji. Okay, that's one they've asked. I'll read all the requirement once. So, find the portion of investment to recovered from lease rental. That you already know, no? 10 lakh minus 120. 10 lakh minus 120. That way, balance you will recover from lease rental. But you will have to solve under both the assumption. What is that assumption? One, when depreciation is under SLM. Another one is under units of production. That means you have to solve under two case. When depreciation is charged under SLM. One, when the depreciation is charged under units of production. Third one, determine the minimum lease rental needs to be recovered to recover the balance cost of investment after adjusting tax shield on depreciation. Under both the depreciation method, if equipment lease us, we charge lease rental uniformly over 4 years. That means we are charging lease rental on what basis? Same every year. Or second case, mein lease rental follows client's utilization pattern. That is 1:2:3:4. Oh, that means another 2 case here. So basically there are 4 cases. Can you tell me what are those? One, no, lease rental. Lease rental can either be charged on a SLM equal basis or units of production. This is case number 1. This is case number 2. We have sold the asset or we have leased the asset. That means we will only charge depreciation. Depreciation, either you can charge based on SLM or you can charge based on units of production. This is your case number 3 and this is your case number 4. All the 4 cases mean you need to give out the answer. Fine. Now, how to do it? Presentation, I'll tell you. It's an easy question only. Just watch out. So far, okay? Now, everybody, check here. Some basic data. What is the original? Tell me. Let's see how you remember or not. What is the original cost of the asset? 10 lakh. Residual value? 0. Life of the asset? This everybody remembers. Huh? Now, first, let's go for depreciation under straight line. Depre under straight line. What will be the depreciation every year? Original cost 10 lakh minus salvage value 0 divided by life 4 years. How much depreciation per annum? Depreciation per annum will be 2.5 lakh. Correct now? Depreciation is an expense. You will get what? You will get the benefit on what benefit means? Expense is a benefit or tax? Due to this expense, tax will reduce. Okay, so tax saving is the benefit. Yes or no? So what we have to do here? What we'll have to do over here? Tax saving every year due to depreciation is how much is the tax rate? 25%. So 2,50,000 into 25%, you do how much is that? 60,500. This is the benefit we will get every year. Correct, people? Everybody comfortable? Because due to depreciation, tax will reduce every year. What is the tax rate? 25%. So take the depre amount and multiply tax rate. That will be the benefit that you will get from the depreciation every year. 60,500. 1 year or every year? Every year. Is this number changing or same every year? But 1 second, hang on. Or maybe just I'll quickly show here. Year 1, 2, 3, 4. What is the benefit you have got? 60,500. This 60,500 first you will get at the end of first year because depreciation we charged at the end of the year. Again 60,500 benefit you will get at the end of. What happened here? Okay, let it be. Again 60,500 benefit you will get at the end of third year. Again 60,500 at the end of fourth year. That means all this benefit you will get it now or in future. But we want it on future value platform or present value platform. How do you get present value? Multiply discount factor. Number is different every year or same every year? I mean, should you want to take each year ka number or multiply PVIF? PVIF or PVAF? So that's what I've done here. Each year ka cash flow is how much? 60,500 multiplied by PVIF or AF. What is the discount factor? Somewhere we saw that. Where is that? Where ma? Cost of capital discount factor is 10% given. So find out PVAF for me at 10% for 4 years. 3.170. So 60,500 into 3.170 will give you total present value of savings 198,125. Any doubt in this number? We'll go working note by working note. Easy over here. Watch out. This is the benefit when depreciation is under which method? SLM. Is this the only applicable or you have units of production also? Units of production also. Can we do that or you need some more time here? Can do? Now, is units of production ratio same or 1:3:4 is? Means depreciation every year will be same or different? Calculate. 10 lakh is the cost of the asset. You will depreciate in 1:3:2:4. How much will be depreciation? 1 lakh, 2 lakh, 3 lakh and 4 lakh. That's a depreciation. Now can we use PVAF or PVIF? Because each year ka depre same or different. This is every year ka depreciation, correct? Benefit means depreciation or tax benefit. So benefit means what? Due to depreciation, tax will save. How much tax will be able to save? 25%. Take depreciation amount and multiply 25%. 1 lakh ka 25% how much? 25,000. 2 lakh ka 25%. 50. 3 lakh ka 25%. 75. 4 lakh ka 25%. 1 lakh. This is your depreciation under units of production method. When we multiply tax rate, you will get the tax savings due to depreciation. Understood? Everybody good? This was 62,500 in the last case. Same. It was 62,500 in the last case. But that 62,500 was different every year or same every year? Hence we used what? PVAF. Is it same every year or changing? So what we have to use? PVIF. So discount factor at 10% only, but you take each year ka discount factor. Now this tax saving of 25 you will get immediately or at the end of first year. So future value. This 50 ka benefit you will get at the end of second year. Again, future value. So all these are future value. To get present value, we multiply discount factor. Multiply the discount factor, you will get present value. Any doubt in that number? That is what they asked. What is the benefit you will get due to depreciation under straight line method as well as units of production? Observe. Aram se we will go over here. This is one main. Everybody okay? Order? Okay. Next is depreciation. You tell me, how did you get this particular 25,000 for me? I'm just curious about that. How did you get this 25,000? You took depreciation and multiplied tax rate. Keep that in mind. You took depreciation and multiplied tax rate. Why? Why depreciation? Again, the sentence carefully. Depreciation is a expense. On expense, you will pay tax or save tax. Save how much tax? 25%. Hence, we took 1 lakh ka 25%. Pakka. Later, if you ask doubt, I will not answer. Pakka. Now, lease rental. Lease rental given a missing. But leave that portion out for the time being. Lease rental is an expense or income. Income. On income, you will save tax or pay tax. Pay tax. That means on whatever you did for depreciation, same thing you will do for lease rental income also. No, depreciation is an expense. On expense, you will save 25% tax. But lease rental is a income. On income, you will save tax or pay tax. That means 100 rupees lease rental income if you collect. 100 rupees lease rental income if you collect. Really, company will get 100 rupees or our fine Nirmala Sitharamanji will take 25. On income, 25 rupees will go away as tax. What will be our true sense mein income? 75. Correct? That means income for us is not 100, it is 75. Agreed. Because on income, we have to pay tax. Comfortable, no people? That means our cash inflow, because all this decision, we need cash flow, no? So our cash inflow, though we collected 100 rupees, net mein our cash inflow is 100 or 75? 75. Yes. Sir, people from 100 directly you can jump to 75. Tell me. This is before tax, this is after tax. 100 is before tax, 75 is after tax. From before tax, how do you jump to after tax? Take the lease rental and you do 1 minus tax rate. 1 minus tax rate. So 100 into 1 minus tax rate. What is tax rate? 0.25. 100 into 0.75. How much people? 75. Agreed. That means, again I'm asking, on lease rental, you will multiply 25% or 75%. The whole drama was on this. Everybody got 75%? Pakka. Now, well, when I multiply 75%, you will not say why, you, who and all, no? Pakka? Okay. Now look at this. Lease rental given a missing. Lease rental also, we have two options, either to collect on straight line basis or on a units of production. First, let's assume normal things. So, lease rental on what basis? Straight line basis, meaning every year we'll collect same lease rental from our client. But is that given or not given? So let's assume X or A, B, C, D, whatever you want to assume. So here I've taken it as let lease rental be X. Okay. Sir, we need for our analysis income or cash flow. Cash flow. On income, you have to pay tax. If I collect X rupees as lease rental income, like previously, 100 rupees if I collect as lease rental income, for me, 100 rupees will come or 75 rupees will come. Because 25 will go off as tax. That means what is lease rental after tax basis? If it is 100 means number is 75. Now is it 100 or X? If this is X means, if lease rental before tax is X means, after tax it will be what? X into 1 minus tax rate. X into 1 minus tax rate. Correct? So tax rate is 0.25. So how much is it? 0.75. I'll give you a minute. Is this number okay for you? This is the final cash flow I will get every year. Will this number, look at the heading, I'm charging lease rental on what basis? SLM. That means every year number will change or same. That means you have to have 4 columns or PVAF method. Remember NPV. If you have your future cash inflows, this is your future cash inflow. How do you calculate NPV? If you have your future cash flows, what do? Multiply discount factor and get them on present value platform. So 0.75, or if you want one more, 0.75 you will get now or at the end of first year. If you want, once again, I'll write here. Year 1, 2, 3, 4. First year you will get 0.75x. Second year also different number or same number? Because it is what basis? SLM. Third year also 0.75x. Fourth year also 0.75x. That means all these are on present value platform or future value. But we are doing the decision future or present value. Hence what we have to do? Multiply discount factor. Each year ka discount factor or PVAF? PVAF. At what rate? 10%. For how many years? 4 years. We have to find or already found. How much is that? 3.170. So take 0.75x and multiply PVAF. PVAF is 3.170. How much is this number? 2.38x. That is the present value of lease rental for how many years? 4 years. Okay, Naji. Is this number good, Aji? Practice this question. Okay, now you will say yes. So after going home, you will be like, "Thoo." That wala feeling will come. So practice this question once immediately. If you want, you'll anyway upload this video also, so you can refer to that later as well. This is good. Next, sir, this is charging lease rental on what basis? SLM. Is this the only option available, or units of production is also there? Units of production is also there. What is units of production? What is the ratio of units of production? 1, 2, 3, 4. That means if let the lease rental be X. Okay, let the lease rental be X. First year lease rental will be X, means second year will be X only, it will be 2X. Production is 1, 2, 3, 4. So first year ka X means next year it will be 2X, next it will be 3X, then it will be 4X. This number is same every year or changing every year? Once again, same thing. Make me happy. This is lease rental income. This is lease rental income. For our decision, we need income or we need cash flow? Cash flow. This is your income. On income, you have to first pay tax. Then only you will get cash flow. That means how much tax you will pay on this income? 25%. After paying tax, how much will remain with me? In my income, 25% government will take. How much remains? 75%. So, I mean, this, if you want to get this on an after tax basis, what you will do? 1 minus tax rate. I mean, you will multiply by 0.75. 1x into 0.75 is how much? 0.75x. 2x into 0.75 is how much? 1.5x. 3x into 0.75 is how much? 2.25. 4x into 0.75. 3x. Yes, sir. Now, all this income you will get immediately or in future? This 0.75 you will get at the end of first year. This 1.5 you will get at the end of second year. This 3x at the end of fourth year. So, that means all these are what? Future value. How do we get them in present value? Discount factor. These numbers are same every year or different? PVAF or PVIF? No, PVIF. So take the number and multiply discount factor for each year. You will get the present value. And add all that, you will get how much? 5.66x. Done, Naji. I'll give you a minute. Observe. I will take a water break. Now last finishing touches. So you need some more time to review now? If you need, I'll wait. I don't mind. Anyway, we are not understanding why wait, no? Can you give me a summary of what we have done till now? Would you like to try? No, I give Allah, you give. Yeah, please, you only give, no, sir. Done. Fine. Okay, listen. We purchased the asset for how much value? 10 lakh. Now, on asset we have purchased means we can charge depreciation. We have two methods to charge depreciation. SLM, units of production. SLM means we will have same depreciation every year. So 10 lakh is a cost, salvage value 0, life is 4 years. How much is depreciation every year? 2,50,000. Depreciation is an expense. Due to expense, we will pay tax or save tax. Save tax. Saving tax is a benefit. It's a cash flow. How much tax you will save? 25%. I mean, take every year ka depreciation. Every year ka depreciation multiply 75% or 25%. 25%. Because due to expense, 25% tax saving benefit you will get. So take every year ka depreciation and multiply 25%. You will get the number. Okay, Naji. How much is that? the 2,50,000 ka 25% if you do, you'll get 60,500. But this 60,500 benefit, you'll get it immediately or end of respective years. First 60,500 benefit you will get at the end of first year. Next 60,500 benefit you will get at the end of second year. That means all these benefits are on present value platform or future value. Hence multiply what? Discount factor. But since the number is same every year, should we have to use PVIF or PVAF? So hence we took 62,500 multiplied PVAF and got the total benefit in present value terms due to depreciation. How much is that? 1,98,125. This is what depreciation ka benefit under straight line method. Now what is one more method acceptable for depreciation? Units of production. In units of production, you will depreciate the asset based on production pattern. What is a production pattern? So 10 lakh amount of asset will be depreciated in 1:2, 2:3, 4. So what will be depreciation for first year? 1 lakh. Second year, 2 lakh. Third year, 3 lakh. Fourth year, 4 lakh. This is your depreciation every year. Okay. On depreciation, you will pay tax or save tax. Saving tax is a benefit. It's an inflow. It's a cash inflow. How much you will save? 25%. So take the depreciation, multiply 25% inflow. You will get it. But all this inflow will happen immediately or respective year ending. I mean, all these are on which platform? Future value. Multiply discount factor. But is the number same every year or changing? So PVAF or PVIF? PVIF you use and you will get the present value of the benefits. Due to, basically depreciation ka present value of benefits they have given under units of production method. Now we have only this SAW or we have lease rental income also. One more component we have called lease rental. Now lease rental is an income. Lease rental is a income. On income we will save tax or pay tax. 100 rupees lease rental income if you collect means how much you have to pay as tax to the government? 25% of that. 100 ka 25% is 25. So how much will be left with us? That means in true sense cash flow for us is not 100, it is only 75. Okay, now from 100 directly can you get 75? Yes, how? 100 lease rental into 1 minus tax rate. Okay, ji. Now lease rental I have assumed 100. Have they given? No. Just for explanation I took 100. Since they have not given, we have assumed lease rental to be X. Lease rental to be X. Now like depreciation, lease rental also we have two options. What are those? Either charge lease rental on an equal basis, SLM basis, or based on units of production. If you charge lease rental on a SLM basis, every year ka lease rental will change or same? Same. How much? I have assumed that to be X. Okay. Though you have collected X rupees from your client, X rupees will come to you or 25% of that will go to government. Lease rental is an income. Of that 25% will go off to the government. That means for us, finally, how much money will come? 25% or 75%? 75%. That means X ka 75% if you do, you will get 0.75X. This 0.75X, I will get it at the end of every year. Different number or same number? Same number. I mean, this 0.75 I'll get it at the end of first year. This 0.75 I'll get it at the end of fourth year. This is present value or future value. How do you get them on present value platform? Multiply, but different number or same number? So PVIF or PVAF? Took 0.75x and multiplied at 10% ka PVAF for 4 years. And you got this particular number. Yes, Ajay. Now same number will work out for what basis? Units of production. Lease rental is how much? X. If first year ka lease rental is X means second year it will be X or 2X. Because units of production is in the ratio 1:2:3:4. If first year is X means second year will be 2X, then 3X, then 4X. This is the income. This is the income. On income, how much will go away as tax? 25%. So what will be our cash inflow? 75%. So take this number and multiply 75%. X ka 75%, 0.75. 2x ka 75%, 1.5. 4x ka 75%, 3. But all this income you will get it now or in future? This 0.75 you will get at the end of first year. This 2.25x you will get at the end of third year. So all these are what value? Future value. Multiply discount factor to get the present value, which is this. That's all we have done till now. Correct, Ajay? Manageable. Now last setup. People, they read this line once again. No? Determine the minimum lease rental to be needed to be recover the balance cost of investment after adjusting tax shield on depreciation under both the methods. Once again, determine the minimum lease rental to be recover the balance cost of investment. 1 second. How much did we invest? 10 lakh we invested. Depreciation is an expense. On expense, we paid tax or saved tax. So that's a benefit. Now, 1 second. If you're following straight line method, how much benefit you will get? 1,98,125. Sir, I bought an asset worth 10 lakh. I bought an asset worth 10 lakh. I already got how much benefit due to depreciation? 198, 125. I mean, should I have to really recover 10 lakh from my client, or balance is good enough? What is balance? What is balance? 10 lakh minus 198, 125, which is 801, 875. Correct? This I have to recover as what? Lease rental. Understood? Everybody good? This is what we have to do. Pakka. But 1 second, check everybody. Here there are 4 cases. What 4 cases? 1, when the lease rental is based on units of production. I can charge lease rental based on units of production. I may charge lease rental based on units of production. My depreciation can be on SLM, or it could be on units of production. This is one case. Now, lease rent I will charge equally. But depreciation I can charge equally or based on units of production. Any combination is okay. So 4 combination. All the 4 you need to solve. Correct? No. Correct on, people. Getting no. Yeah. Cost of investment is same in every case. How much is that? 10. Now this, if you figure out this, it's very easy. If you put up the table. Now check. Don't forget the heading. We are in, what is the heading? Lease rental based on units of production. Okay. And depreciation is on what now? SLM. Now, if your depreciation, if you're claiming on SLM basis, means you already got some benefit. What is the benefit you will get when you charge depreciation on SLM basis? 198, 125. So, wherever you see depreciation on SLM, which figure you will update? 198, 125. Update that. Okay, now? Yes, sir. Correct, no. Correct, no. Sir, if depreciation is based on units of production, how much benefit have you got? If depreciation is based on units of production, how much benefit you already recovered? 188, 650. Wherever you see depreciation based on units of production, you will write what number? 188, 650. This is depreciation based on units of production. 188, 650. This is depreciation based on units of production. 188, 650. Now very simple. Updation is okay now. In 10 lakh mein 198 you have already recovered. In 10 lakh mein 198 you have already recovered. What is the balance investment to be recovered? 801, 875. How are you getting that? 3 is equal to what? 1 minus 2. These took a minus, this number. 10 lakh minus 188, 650, this number. 10 lakh minus this number. Like that I've calculated. Okay, na sir. And how will you recover this? Through lease rental. And you already know lease rental in X terminology. Yeah. 2.38x, 5.66x. 2.38x, 5.36. Yes, no. 1 minute, careful. This is 2.38x when 2.38x will be the answer when you charge lease rental on SLM basis. Whenever you say lease rental is on SLM basis means this. Correct? No, lease rental equal means SLM basis. Whenever you see this number, you will update which x. So 5.66 or 2.38. So that means here lease rental is on equal basis. That means this is what number? 2.38, 2.38. Yes, correct. Whenever you are charging lease rental on equal basis, what is your total lease rental? Here, very careful. When you are charging lease rental on SLM basis, present value of lease rental will be 2.38x. Here you are charging lease rental based on units of production. So here can I write 2.38? No. 2.38 is a number applicable for what basis? SLM or equal? This is equal? No. Which is equal? This. So in this section, I will write 2.38x, 2.38x. This is which section? Lease rental based on units of production. Whenever lease rental is based on units of production, what is the present value of lease rental? 5.66x. That means under these two sections, I will write 5.6 is 5.66. Yes, these two are equal. Because that's what I was able to recover. No. So 5.66 is equal to 8,01,875. So equate that. 5.66 is equal to 8,01,875 means how much is x? X is 8,01,875 divided by 5.66. How much, Guruve? 1,41,674. That is my lease rental. I will charge under which method? When I go for lease rental based on units of production, depreciation under Syllabus. Basically, these two you equate and get X. Calculate X for me here. 8,11,350 divided by 5.66. How much? 141,674. These two you equate and get X for me. These two you equate and get X for me. Huh? This is a different number. Okay, no worries. 140, 348. What about this? These two you divide. 8,01,875 divided by 2.38. 3,36,922. That means this divided by this is correct number. This is your lease rental recovery. Easy question only, to be honest. Last May, you'll have to be a little careful in terms of updating what value. That's all it is. And these sort of questions, if it comes, they will not modify much. They'll just change the name and they'll probably, instead of 10 lakh original cost, they may make it 20 lakh or 1 crore. That's ICA favorite answer. 1 0 they will add or 1 0 they will cut. And it will come in exam. Okay, so that's the way usually they do it. So you'll not have much modification. Straight away chapo. Same copy paste. Full marks. One good thing is when all these questions come, no people, 90% of the students skip. And when tough question, a little tricky question comes, the instruction will be given. Usually it will be like, be a little lenient in terms of marks. Small working notes also will carry marks. Like depreciation will carry 1 mark and all. Because they know that people will not be able to solve, majority of them may not be able to solve everything fully. So they would like to give that lenient approach there. So hence, better to practice all these questions also once. Okay, na sir? That is about this particular question. And this one is same question we have. Question number 9 is working capital. It's a repeat question, nothing new. 10th is a theory question, not required. So this is about your RTP May 26 wala Athimka RTPs. Thank you. Hello people. So let's continue our FM MTP discussion. Now we'll start FM ka MTP discussion. So now in this session we'll be doing MTP 1 and MTP 2 of May 26. Only the new questions will be covering. Overall, not many new questions are added. Only like 2 or 3 new questions are there. Most of them are repeat. Okay, so let's see. The case-based question. XYZ is one company. They have been in operation for 15 years. Fine, fair enough. While analyzing capital structure, they have given some data. But before this, should we read the whole data or first read the requirement? Read the requirement. So if you read the requirement, they ask cost of equity, cost of debt, NPV, profitability, index, discounted payback period. So looks like cost of capital and investment decision ka combo case. So those are some of the requirements of this question. Fine. With that in mind, let's read. We can directly go into the numbers. Book value they have given, not market value. Book value, equity share capital 15, reserves and surplus 5. These two put together becomes equity. How much equity? 20 lakh. What about debt? 10 lakh. So the ratio is 2:1. The weightage of debt and weightage of equity, 2:1. Okay. Next, market value data also they have given. Market value of equity is 3 times the book value. Looks like a similar question. In RTP also we had a similar one. Okay. Now, do you know the book value of equity, people? Yeah, book value of equity is how much? 20 lakhs. Therefore, market value of equity will be same or 3 times. So 20 lakh ka 3 times. How much is that? 60 lakh. The market value of debt is 2 times the book value. What is the book value of debt to? 10 lakh. So the market value will be 2 times of that, which will be, yeah, this number. So the final value will be 60 lakh is to 20 lakh or 3:1. That's the market value ka weights they have given. So book value weights available, market value weights available. You know what sort of a question this is going to be? 2 equations mostly. All right, let's see. Weighted average cost of capital they have given. KO they have given. As per book value, KO is 10 and as per market value, KO is 10.5. So we know the equation for KO. So that means this is easy, no sir. Pure substitute, same was there, and in fact RTP also. It was in a way, it's, you could say, repeat. First part is very same. Now this they have given relating to investment. This is an investment decision wala case. Can we first do of cost of capital? And now tell me how do we solve? You know that equation, a one-liner. Weight or WO is equal to, or KO is equal to weight of debt multiplied by cost of debt, weight of equity multiplied by cost of equity. They have given KO as per market value also, KO as per book value also. So here what IC has done is they have assumed cost of equity be X, cost of debt be Y. Should we assume like that, or we can keep KD, KE only? We can keep KD and KE only and solve like the way we did in RTP. Here they have done that. And weights we already know. And here they have used under one-liner format, or they have used a table approach. Table approach. However you do, answer is any which way, same. Can we at least go through this maybe? We have another way also. Alright. Cost of equity they have assumed X, cost of debt they have assumed Y. Weight, this book value. What is the weight as per book value? We already know. As per book value, the weights is what, people? 20 lakh is to 10 lakh, or 2 is to 1. So they have not, if you do 2 by 3, I think you will get decimal. Point something, 667 you will get. So they have kept the fraction only, I think. 2/3. I think they have taken the weight as 2/3. Check. Weight of equity is 2/3. And weight of debt is 1/3. Multiply these two. This will be 2/3 of X. This will be 1/3 of X. Will be equal to overall cost of capital. As per book value, overall cost of capital is given to be 10%. So one equation we got. What is that? 10 is equal to 2x by 3 plus y by 3. Both denominator is same. So it will be what? So you can just send 3 to the other side. It will be 30 is equal to 2x plus y. Substitute. Therefore, y is equal to what? 30 minus 2x. Done, Sarji? One they have substituted. This is one equation. This is only one equation we'll get, or one more we'll get? One more based on what? Market value. Market value is also given in the question. What is market value weights and market value KO? Market value KO is 10.5. What is market value weights? 3:1. This, if you want, you can take straight away 0.75 and 0.25, or keep the fraction 3/4 and 1/4, whatever you're comfortable. I think they've kept the fraction here. Same, one more table they've built up. Same, cost of equity is X, so cost of debt is Y. What is the weight as per market value? 3:1. So 3/4 and 1/4. In order to get the overall cost of capital, these two will multiply. 3/4 of X, this will be 1/4 of Y. KO as per market value is given as 10.5. So what is the equation we will get here then? 10.5 is equal to 3x by 4 plus y by 4. So therefore 10.5 is equal to 3x plus y divided by 4. Therefore 3x plus y is equal to 4 into 10.5. How much, people, that is? 42. Now y you substitute. What is y? Instead of y we will write, first equation we will substitute 30 minus 2x. So instead of 3x plus y we will substitute it as 30 minus 2x is equal to 42. 3x plus 30 minus 2x, 3x minus 2x, how much, pa? X. So x plus 30 is equal to 42. Therefore x is equal to 12 or 12%. X is what we assume? Cost of equity. So therefore cost of equity is how much we got to? 12%. And y we know 30 minus 2x, and we'll get. Is this some same? I mean, this question is same as RTP wala question. No change at all. Ditto. This is done. One part of the question is done. Any doubt or sorted? Okay. Can we review the next part of the question? So cost of equity, cost of debt covered. Next they've asked investment decision ka. They've asked NPV and profitability index. First let's read the data relating to that. How much investment you're planning to do? 20 lakh. Working capital is also there. That means at year 0, what will be the total outflow? Equipment investment cost 20 lakh, because working capital at year 0, you will take it as an outflow. End of the project. Here it is, project is ending at year 3. You will take it as a inflow. So at year 0, outflow will be 23 lakhs. Correct, Aji? Okay. Salvage value, how much? 2 lakhs. Salvage value will get end of the project only, which is 3rd year. Depreciation is on straight line basis, 3 years. Cash inflow they have given, but they have given cash inflow before tax and depreciation. So that means we need to do that particular adjustment. Cash inflows they have given. Assume tax rate is 25%. Investment rate is 2% more than pre-tax cost of debt. This is one hidden adjustment. I'll come to that. Leave. So first, cash inflow. Can we take this number, or this is before depre and tax? This number is before depreciation and tax. So what we'll do first? From this you have to reduce depreciation. You will get profit before tax. Reduce tax. And then you will get profit after tax. Then 5 adjustments, depreciation and OVAs. So that we have to do. Check, have they done that? Easy. I think this is straightforward. 8, 9, 10. Check the solution here. Cash flow given is 8, 9, 10. Minus depreciation. How much did you buy the asset for? 20 lakh. Salvage value given to be 2 lakh. Life of the asset is 3 years. What is depre every year? So from this, if you reduce depreciation, you will get profit before tax. Reduce tax at 25%, you will get profit after tax. Then add back depreciation. Okay, sir. Then O for opportunity cost, not there. W for working capital. There. Working capital, how much? 3 lakhs. When you will recover, now or end? End. A for additional capital, not there. S for salvage value, there, how much? 2 lakhs. When? First year, second year or last year? Then you will get your cash inflows. Okay, Sirji. Multiply this with the discount factor, you will get present value of cash inflow. That they are presented in a separate table. Okay. At year 0, outflow is 20 lakh or 23 lakh? 23 lakh. How? 20 lakh for the asset and for working capital it is 3 lakh. So total 23 lakh. This is a cash inflow for every year. In fact, they should have put the sign properly over here. So this first one is positive or negative? Outflow. No? That's okay. Later they will change. They'll write 1 minus 2, something like that they will say. But we will follow the same pattern. Inflow we show it as positive. Outflow we show it as negative. So that means automatically NPV you will get. Yes, no, sir. Any problem, sir? Got it, sir. Now one hidden adjustment was there, which is a discount factor here. Any problem in the last bench there? Year 0 mein, what you have to do is working capital at year 0 we take it as a outflow. At end of the project we take it as a inflow. So at year 0 mein you purchased equipment cost 20 lakh. Plus you also need to invest working capital 3 lakh. So total investment will be 23 lakh. Same 3 lakh one, you at third year mein you will recover it. So this will be minus 20 minus 3. So this is minus number. So here 3 lakh will become positive. Anything else or okay? Now discount factor, there was a hidden adjustment over here. Check everyone. What is the hidden adjustment there was? Read this line. Tax rate is 25. Sorted. Investment rate is 2% more than pre-tax cost of debt. Pre-tax cost of debt. The keyword there is pre-tax. Do you know cost of debt? We solved. What is cost of debt we got? 6%. Sir, when we say cost of debt, it is on a pre-tax basis or after-tax basis? After-tax basis. 1 second. This 6% is on an after-tax basis. Correct? How much is the tax rate? 25%. That means, can I say 6% is after paying tax means this is 75%? 25% tax gone, no? So in 100 mein 25% tax gone means how much remains? 75%. So 6% represents what platform? 75%. Pre-tax means 75% platform or 100% platform? For 100%, how much is the number? If you want, I can directly take this as 6 if you want. This is 6. 6 represents 75%. For 100%, how much? So x is equal to what? 6 into 100 divided by 75, which is 8%. Done, Naji. If you want, I can do shortcut method also. KD is equal to interest into 1 minus tax rate. KD is what? 6. KD is 6. So we don't know interest. Interest into 1 minus tax rate. Tax rate is 0.25. Now what will be your interest rate? 6 divided by 0.75, which is 8. Either you can solve like this or you can do proportionate like this. So pre-tax wala number will be how much? If post-tax number is 6 means pre-tax number will be 8. Okay. So far good. Because why did I find pre-tax number? In this problem, why did I find pre-tax number? They said in the question, investment rate is 2% more than what? Pre-tax cost of debt. They mentioned pre-tax, hence I first find pre-tax. Pre-tax number is how much? 8%. Now our investment will fetch us 8% return or 2% more than this. So how much is this? 10%. For 1% it's an investment. For 1% it's a return, means for another person it's a cost. Right now when we borrow the funds from debenture holder, for debenture holder it's a return. For us it's a cost. So therefore cost of capital is what? 10% over here. It was not given. We had to find it out. Goinda got it. So discount factor hence is 10% over there. That's what I've solved over here. KD on a post-tax basis is 6% means KD on a pre-tax basis will be 8. And our discount factor, they said, will be 2% more than that. So 8 plus 2% is how much? 10%. So take that discount factor 10% and solve. Yes, sir, Sarji. Now NPV finding out any problem. Huh? This is present value of cash outflow. This is the present value of cash inflow. When you net off, finally you will get the NPV. That's the answer. Next, they ask profitability index. People, how do you find profitability index? Profitability index. Present value of cash inflow, which is this number, divided by present value of cash outflow. That number. Do it. These three you add and divide by 23. You do. These three you add and divide by 23. How much are you getting? Huh? Here they are saying 1.05. You also got 1.05. Okay. Then they also ask discounted payback period. Payback period alla. Discounted payback period. Payback period considers annual cash inflows. Annual cash inflows. This. Discounted payback period considers payback period rather considers annual cash inflows, which is this. Discounted payback period considers annual cash inflows or present value of cash inflows. Present value of cash inflows is this number. Is this number same every year or changing every year? So we have to find what? Cumulative. So find cumulative for me. First year 6.82. Second year it will be 6.82 plus 6.81. How much? 13.63. 13.63 plus 10.51. 24.14. What is your initial investment? 23. So that means 23. Any number exactly matching at 23? No. That means it is somewhere between what to what? Year 2 and year 3. That means what is that formula, people? To take the lower number. Wait, it's not. It's playing. Take the lower number plus required cash flow divided by actual cash flow. Required cash flow will be what? 13.33 minus 23 or 23 minus 13.33. How much is that? 9 point something. Actual cash flow will be 10.51 directly, or you can do these two minus. You will get 10.5. When you do it, you will get 2.89 years. Sorted out. That's your discounted payback period. That is a faltu question. Easy. The only maybe hidden adjustment here was, or good adjustment here was, discount factor. That pre-tax, post-tax. The rest everything is pretty straightforward. According to me, this question over. You need some more time? Anything review? Anything observe? No issues. Okay. I think we have solved how many? 5 questions. Okay. Moving along. This is capital gearing ratio again. Capital gearing ratio, you already know the formula. That is preference share capital plus long-term debt in the numerator divided by equity share capital, reserves and surplus in the denominator. I have to take you through, or okay. This is all numbers is given. You have to substitute and get the answer. Pretty very easy there. This one is Walter formula. Yatho. Walter is again any difficult or easy? What is Walter ka formula? D plus R into E minus D divided by cost of equity. E given, D given, cost of equity given, R given. Everything given, you just have to substitute. Very straightforward wala MCQ. Nothing. I've just solved it, but nothing to be done as such. Next, 8th MCQ. A firm has a sales of 75 lakh, variable cost 42. Sales minus variable cost is contribution. Contribution minus fixed cost is EBIT. Then they have given debt. Debt carries what interest rate? 9%. Then they have also given equity. They are asking favorable financial leverage. When they are talking about favorable financial leverage, we need to compare the interest rate with R. Here debt is there, no? When debt is there, see, R could be return on equity or it could be return or ROS. Since here debt is there, what do you think will be the better one? ROS. And how do you get ROS? EBIT divided by capital employed. EBIT available or find it. From sales you reduce variable cost, you will get contribution. Contribution less fixed cost you do, you will get EBIT. Correct? Huh? From EBIT, if you reduce interest, you will get the EASH. Okay, but EASH is not required because any which way we can stop at ROS. How do you get ROS? EBIT 39 lakh divided by capital employed. Capital employed means only debt or all long-term source of finance. Debt plus equity. Add how much is that? 55 lakh plus 45 lakh. 1 crore. So 39 lakh divided by 1 crore is how much, people? 39%. 39%. That's your R. And what is your interest rate? 9%. Since R is greater than cost of equity, this is an unfavorable financial leverage or favorable? So ROI is greater than the interest on loan funds, hence it is a favorable financial leverage. A straightforward theory MCQ question. You need to find this number and then select the right theoretical answer here. Yes, sir. EBIT is 27 lakh. Oh, okay, no problem. 27 lakhs. But still, I think this will be 27% then. Correct, no? Correct numbers, I don't know. I mean, I just did it in hurry-burry. So, numbers are, I know, fine, it's okay. So, that means final answer will be 27%. But R is still 9% only, no? The final answer changes, same. Final answer is same. Can I go for the next one? Okay. This is not required ratio question. We have a same question, okay, in the class. So, this one, no? This one, I'll read it. I think we have done it in RTP. You figure it out and you let me know. Same question, I think we did in RTP. Same, just attempt RTP only. CAPM model, remember? Zebra. We had to find zebra ka. They had given A and B ka. Same thing here. A and B ka they have given. Now we need to find which ka. Not zebra ka, but C ka. We are not zebra now. We are C. They have given cost of equity and they have given beta. Now tell me, this is different or same? Use the same equation of CAPM model. You will get RM and RF. But careful. Here they have asked treasury bill ka rate question mark. Stock market ka rate question mark. What does treasury bill mean? Treasury bill means RF. Risk-free rate of return. We call it as treasury or RBI bonds or government bonds. So that means this is nothing but RF. Stock market means RM. They asked RM and RF only, but not directly. They asked it as Nifty and treasury bill. Treasury bill is RF. Nifty is RF. So two equations, solve and get it. Clear? I've solved it. You want me to, if you want, I'll quickly show it. A and B ka they had given CAPM model. Same thing we did in RTP. So you want me to take you through each step or fine? Fine. So that's what I've written here. RF is your treasury bill ka rate, which is 8%. Finally, RM you will get 14%, which is your market rate. That's all. Nothing else in this. Can I move on, people? Okay. 1C not required. Same question we have in this is investment decision ka question, study material question only. It's there in our class note also. This is also study material question. Same thing is there in our class notes. This is also study material question, no, or I don't know whether study material, it is there in our material. This one we will do. This is a new framing. Investment decision ka question number 3 is a new framing. Let's see what we can learn from this question. Easy, but they given a dump of data. Carefully read the question. Being a financial controller of Shilpa Limited, they have provided you with the following debt collection policy of debtor. This is your debtor management wala question. Working capital ka. Now they have given age-wise analysis. Age-wise analysis means from how many days from the due date has passed and the debtor has not paid us the money. What did I say? Age-wise analysis simply is a report which captures from the due date. We have to collect money from debtors. Due date has already come. From the due date, how many days more is over and debtor has still not paid? Like here, 31 to 60 means what? From the due date, 31 to 60 days has passed. Still this debtor has paid 1,05,000 or not paid. Now here, 91 more days, 1,62,000 means what does it mean? This customer D, he has outstanding for more than 91 days. How much amount? 1,62,000. Age-wise report is simply a report which captures what is the overdue in days. Okay, you can pull this report in any platform up to 10 days, 10 to 20 days, 40 to 60, any platform. Here they have given it as what? Current. Current means currently it is due. Immediately it is due. This is from the due date 31 to 60 days is already over. Here from the due date 61 to 90 days is already over. Here from the due date 91 days or more is already over and these customers have not paid us the money. And totally how much we need to collect? 21,21,800. So till now age-wise report was only done at a theoretical level. We didn't have any question on aging report. Now they have built up one. Fine. Check this. Normal credit terms, 30 days. Interest of 2% is charged on accounts overdue for more than 45 days. So if the customer has not paid us for more than 45 days, how much interest we will collect from that customer? 2%. Interest of 4% is charged or collected on customers overdue for more than 75 days. Okay, what about 91 days? Have they told anything? No. That means interest is only calculatable on these two amounts, correct? No. Why? 2% is for overdue for more than 45 days. 45 days means it comes here. Here, interest of 4% is charged for more than 75 days. 75 days means it comes here. For 91 days or more, they have not told anything. Let's see why so or what so. Cash discount of 2% is given to customer who make the payment within 10 days of the invoice getting due. Within 10 days of due date only, if the customer pays, we are ready to give a 2% discount. Okay. Additional info, 40% of the invoice value after bad date. The keyword there is after bad date. Falling in the aging category 31 to 60. That means this category. Full amount of 40%. 40%. But 40% or 40% after adjusting bad debts. After adjusting bad debts, 40% of the invoice value falling in this category pay after 45th day but within 60th day. With 1.5% being uncollectible. Uncollectible means bad debts. Okay. 25% of the invoice value after bad debt falling in the aging category of 61 to 90 days pay after 75 days but they pay within 90th day with 3% being uncollectible. So in this category 61 to 90 categories, how much is a bad debt? 3 debts. If you want, I'll write the data also. Bad debts I will write here. In the first category 31 to 60, how much was bad debts, people? 1.5%. In the 61 to 90 category, bad debt was 3%. 15% of the total invoice value overdue for more than 90 days are uncollectible. 91 days is this. In this category, how much is uncollectible? 15%. So here bad debt percentage is 15%. Here they have not given. That means any bad debts is there or no bad debts? No bad debts is there in this category. Bad debts is there only in these three category. Percentage they have specifically applied. So how do you calculate bad debts amount? That category ka amount multiplied by percentage. Yes, no. 4,06,500 into 1.5% if you do, you'll get the bad debts. Here these two come multiplication, here these two come multiplication. Correct, no sir? Am I speaking to myself? 50% of the customers invoice value avail the cash discount. I think we are giving cash discount of 2%, no? Cash discount, we will give it to these category of customer or this category of customer. Cash discount of 2% is given to customer who make the payment within 10 days of invoice getting due. This is 10 days or this is 31 days. That means discount is given only for these customer. And what is the total invoice value? 9,94,100. 100% of the customers go for this or 50%? 50%. And how much discount do we give them? 2%. Into 2% if you do, you will get the discount. How much is that? 9,000? 9941. This is a discount. Yes, sir, Ji. Next, administrative cost for managing the debtor is 50,000. This is another cost. Done. Calculate the effective cost involved in the collection process, assuming operating cost of sale is 0.75. Sir, you already know the operating cost. You did for factoring, no? On the similar lines, we'll have to do over here. Or maybe once again, I'll tell you. Explain the aspect of management of receivables. That is a theory. Setting the credit limit. There were 3 points there. Okay, first I'll solve this. Then we will see. Now, this is an easy question. It looks a little fancy, that's all. Basically, if you have to summarize over here, we have few expenses. We have majorly expenses, but we have one benefit. Can you call out the expenses first for me? Expenses or loss first for me? Bad debts. That is one. Then we are giving a discount. That is one. And don't forget, we also have some administrative cost of 50,000. All these are costs associated with debtors. There is one benefit we are getting from debtors. What is that? Interest. We are collecting some interest. So there are 3 costs and 1 benefit. Fine. Can we calculate them first and then we look at the final fine print or final answer for that? Bad debts. So first maybe bad debts we'll calculate. Should I have to explain this once again or directly? This category has a bad debt of 1.5%. Me telling or question? So calculate how much is bad debts here. Here only tell me what is the bad debts amount. Bad debt ka amount 4,06,500 ka 1.5%. 6098. These two ka percentage. Round off and tell me, it's fine. 15636. 15,636. Okay. 2 lakh ka, I think this is 30,000. Done, people. Total bad debt. $730. Okay, now check. That's the first thing that we must have got there. Bad debts 51,734. Everybody okay? Same number we also got for every category. So one cost we have identified. Another cost they have only given administrative cost. Another cost was discount. The discount maybe first we'll calculate off. Discount, people, you tell me, is given to which category? Discount is only given to those customers who pay within 10 days. These are all beyond 10 days, no? These are all beyond 10 days. So that means on this, discount will be given or no discount? So discount will be given only to this customer. This category of customer. How much percentage discount? 2%. 100% of the customers go for this discount or 50%? So 9,94,100 into 50% into 2%. How much is that? 9941. That is your discount amount. Where is it? Here. 9941. So three costs we have already identified. Bad debts, discount and admin cost. One more, if you identify, problem is over, which is what? Interest income. But interest income, check. Let's read that data once again. Interest of 2% is charged on accounts overdue for 45 days. If 45 days is over, means how much interest we will collect? 2%. 45 days means it comes in this category, no? Okay, now 1 minute, hang on. Check here. 40% of the invoice value after bad debt in the age category of 31 to 60. 40% of the customers who fall in this category, they pay on which day? They pay after 45 days. After 45 days. How much customers will pay after 45 days? 40%. I mean 60% of the customers pay within 45 days. Right? And you will charge the interest only to those customers who pay after 45 days. Correct, Aji? I mean, will you calculate interest on the total amount or only 40%? Because only 40% of the customers in this category are paying after 45 days. And after 45 days, we collect interest at the rate of 2%. So let's calculate the interest. How much is this category amount? This category amount is 4,06,500. But 1 minute. 40% of the invoice value after bad debt. This category, how much is bad debt? 6,6098. Correct, no? So there is, use your common sense. There is no point in collecting interest on 6098 people. They are not paying invoice amount only, they will pay interest. Full sale value only they are not paying, means what's the point in collecting the interest on them? So in this 406,500, eliminate bad debt. How much remains? Sorry? This minus this you do. How much? This minus this. Quickly tell. 4 lakh 402 400 402. That's the number. So this is the total amount we have to collect after bad debts. Will every customer pay after 45 days or only 40%? So 40% of them pay after 45 days. Done now. And if they pay after 45 days, how much interest I will collect? 2%. Into 2% you do. How much is this? 4,402 into 40% into 2%. 3,000? 3203 you are saying. How much do they get? 3203. If you want, you can follow present in like ICS done away. Take that category ka amount. First eliminate bad debts. And will you calculate interest on total amount or only 40% people? So multiply 40%, you'll get the value. And on that again multiply 2%, you'll get the interest amount. Done, Naji? Easy. Like this, we have to calculate interest on one more category. Can we try? Now check Redo. Interest of 4% is collected on overdue for more than 75 days. More than 75 days means it comes in this category. What is this category got total? 5,21,200. 5,21,200. Now again same. 25%. Previous category में 40%. Here it is 25%. 25% of the invoice value after bad debts. After bad debts. That means will we collect any interest on bad debts amount or will not? So first from the category amount, eliminate bad debts. How much is bad debts of this category? 15,636. How much remains? 564. This is the amount we have to collect still. Yes, no? Now will every customer pay on time? No. There is the 25% of the invoice value after bad debts, which falls in 61 to 90 category. They pay after 75 days. So 25% of the customer pay after 75 days. I mean 75% of the customer pay within 75 days. Why is the 75 days important? Because more than 75 days overdue happens in this category means how much interest we'll collect? 4%. 100% of the customers pay after 75 days or only 25%? So take into 25%, you know. Okay, Naji. On these customers, how much interest will you charge? 4%. Into 4%. How much is this? 5,05,564 into 25% into 4%. 5056. 5056. That's what we are getting. What does the solution say? 5056. Next category, we have any interest or no interest? No data, so no interest. So that means all the four we have got it, no? Bad debts we got, and then discount we got, interest also we got, admin cost also we got. So there are 3 costs and 1 benefit. First net them off. When you net off, how much are you going to get? Tell me. Take your calculator. Bad debt amount 51,734. This is a cost. Giving cash discount is a cost. 99941. These two you add. Done now. Collecting interest. Collecting 3203 interest is what? Cost or benefit? So minus 3203 you do. I think here cost is more. That's the reason. Minus 5056 interest you do for next category of customer. Fine now. Plus one more cost is there. That is your administrative cost of 50,000. Add 50,000. 1 lakh 103. 103,416. Agreed. This is the cost. Correct. Now people, they're asking this cost. We have got this cost in amount. No, they're asking this cost in percentage. This cost, what we have got in amount, they're asking it in percentage. For that, they give one more information. They have given total cost of sale. How much is total cost of sale? 0.75. What is the total amount you have to collect from debtors? 21,800. This is what total sale value. What is the cost of sale? 0.75. 0.75 of what? The sale value. 75% of your total sale value is nothing but your cost of sale. So take this number and multiply 0.75. 21,800 into 0.75. If you do, what are you going to get? 15,91,350. They are saying. Your calculator is showing same. Yeah. So total cost is 15,91,350. This is the total cost. In this May, debtor related cost is 103,416. So tell this in percentage. Total cost is 15,91,350. In that, debtor related cost is 103,416. So that means what is this cost in percentage? Out of 15,91,350, 103,416 represents debtor cost, which percentage is 6.5 percentage is what they've taken. That's all they asked. This problem. Difficult or easy? Easy, but a good framing. We have not seen this question till now. That way, good question. You can follow same ICA ka presentation. The way they have solved, I think it's nice. So you can follow the same wala presentation. Done na, Sarji? Now, you need some more time or you want me to show you any part of the question anymore or okay? Cost of sale is 0.75 given there on. Okay, sort it out. No problem. Fourth one is a theory question. So, I mean, that's all with respect to this MTP. These were only the new additions. Rest are all were repeat. Now, can we go for MTP 2? Where? 1 minute. Above 75%, 4% interest. No, they've specifically told. We don't know, right? How many of them here in this category, and moreover, whether they in fact, if you just check here, 4% is charged on overdue for more than 75 days. So, but that's what they said. Oh, but here again, they did not, we don't want, again in 91, if you want, you can calculate. He's saying, sir, why don't we calculate this 4% interest on this amount also? You can, in general sense, you can take it like that. You can. That's fine. Or you can assume, one.
But they pay within 90th day.
Which one?
That
That is this category, macha. That is this category.
oh,
That is this category. This category of customer pay after 75 days within 90th day. But this he's saying this category of customer is also more than 75, no? But there is one small contradictory point there will come. Why they have not calculated this is, sir, here 2% interest for 45 days, no? I mean, there are some portion of them here in this 45 days category also. And there is some portion for 75 also. How will you calculate? They have not given the breakup. So it becomes a little difficult to bifurcate. Hence, this category they have not used. But your point, I take it. But difficult to calculate because of 2 to interest there over here. Good one. Okay, so this is sorted. Oh, so MTP 1 done. No, next we'll go for MTP. Sure, looks like smile is coming back on our faces. So MTP 2 is even better. Hardly any few questions. I think this is a case scenario question. Easy only, but we don't have exact same question. So we will run through this question. Whenever they give case people, first we will go through the requirement. They ask payback period for machinery Model X Pro and Model Z Elite. Probably they have 2 machinery. Both the machinery ka payback period hai faltu. Both the machinery ka probably ARR. Profitability index for one machinery. Again, they've asked profitability index for the second machinery. I mean, the whole question is based on investment decision. I think this is easy, no? Payback period and all is aram se. Quickly, we can review of this question. Orion Manufacturing Company, that is a company, is a mid-sized engineering company, blah, 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 and then all they're saying. They want to buy one of the 2 machineries. Model X Pro, Model Z Elite. So, they have given those 2 machinery ka data. Both are new machinery. So, it's not incremental. Both are new machinery. One among these new machinery we will select. Machine X, I'll call this as X, so this is Z. X will cost 20 lakh. Z 25 lakh. Life for same. I mean, EAC and all required or not required? Not required, because life is any which way same. Estimated savings in direct wages per annum. If we buy machinery X, no, maybe X is an automated machinery. So if you buy an automatic machinery, existing laborers are required, or we can send them. So how much wages cost you will save? You will not incur this wages cost, you will save. So that means there's a cost of benefit. So same if you go for Z means how much wages cost you can save? 9 lakhs. So this is a cost of benefit. Savings in some scrap, some wastage you can reduce. 60 here, 1 lakh here. That means this is also what? Benefit. Additional cost, additional indirect material, additional cost, additional labor cost, additional repair cost. All these are benefit or cost? So 3 cost they have given, 2 benefit they have given. Okay now people? Done. Depreciation is on SLM basis. Awesome. Tax rate is 30%. Expected return is 12%, means basically they're saying discount factor is 12%. Calculate the payback period. First, this is a benefit and this is a cost. Our payback period and profitability index and all, they use profit or they use cash flow. Cash flow. How do you find cash flow? From benefit, if you reduce all the cost, you will get profit before tax. Reduce tax, you will get profit after tax. Add back depreciation and then OVAS. Then you will get your annual cash inflow. First find that. They have not given. Quickly do it for machinery X. Benefit you add, cost you minus. So what is the savings? First benefit of X, 7 lakh. And then another benefit is 60,000. Add 7 lakh plus 60,000, 760. And these 3 you minus. 760 minus 30, 730. So 690. What is that number? 6,45,000. That is your profit before tax. Correct, Aji? Similarly, for other machinery, you find out 9 lakh benefit. Another benefit is 1 lakh. 9 lakh plus 1 lakh is 10 lakh. 10 lakh minus these 3 you do 7 lakh. 7 lakh 75,000. Or else can we quickly review off instead of working out each number? So profit before tax, how much we got? 645, 775. 645 and 775. Here they have given. But one cost they have not considered, which we should consider, which is what? Depreciation. Right now, anywhere we saw depre here, check here. Anywhere depre is there? No. Calculate depreciation. This machine will cost how much? 20 lakh. Salvage value not given. Life is 5 years. So what will be depre? Depreciation will be 4 lakh here, or 25 lakh divided by 5 is 5 lakh. This is the cost. So reduce depreciation. 4 lakh and 5 lakh. Have they reduced down? From the number we got, depreciation 4 lakh, 5 lakh, they have reduced. So you got profit before tax. Reduce tax at 30%. So you will get profit after tax. Then 5 adjustment. Add back depreciation. Then O for opportunity cost. Not there. W, working capital. Not there. A for additional investment. Not there. S for salvage value. Not there. So O was not there. This only will become your annual cash inflows. Clear? And is annual cash inflow changing every year or same every year? I mean, payback period, you need cumulative approach or formula? What is the formula? Initial investment divided by annual cash inflow. How much are you investing for first asset? 20 lakh. So 20 lakh divided by 571, 500 if you do, you will get 3.5 years. Second asset will cost 25 lakh. Initial investment is 25 lakh. This is the cash inflow. Divide. You will get 3.61 years. That's your payback period. Now ARR. How do you get ARR, people? Average PAT divided by average investment. Sir, if every year ka PAT, if it is same, means average also will be same. Though the life here is 5 years, 5 times you have to add again divided by 5. Even if you do, you will get the average number same. So average PAT is this only. Divided by, either you can take initial investment or you can take average investment. Both are acceptable. In MCQ format, no. First try it out with initial investment. Answer matches, select. If answer doesn't match, try it again with average investment. I think here answer is matched with average investment. You have to try both in MCQ because one of the answers. Sir, if both answer matches means like that they will not give. That's a typo then. Then if that happens, you will get grace marks in that case because both answers are right. Okay. Alright. How do you get average investment, people? Fancy formula. What is average investment? Half of initial investment minus salvage value plus working capital. Good thing is there is no salvage value, there is no working capital. Initial investment here is 20 lakh. So 20 lakh by 2 if you do that, only average investment. How much? 10 lakh. Yes, now for first asset. PAT is 171,500. Correct, no? Some 17.15%. Same thing, do it for other machinery also. Very faltu this is. Correct, no, people? Next, they ask NPV. Even this is even more worse. NPV, sir, every year cash inflow is same. So you can use PV, AF. I think discount factor they gave somewhere. No, how much was that? 12%. At 12%, use PV, AF for 5 years and multiply. That's all. Take the annual cash inflow and multiply PV, AF. 5,71,500 into what is the PV, AF you are getting? 3.605 is what they are saying. This is the present value of cash. Any doubt? This is the present value of cash inflow. What is the present value of cash outflow? 20 lakhs. So these two, if you did not ask NPV, they ask profitability index. So present value of cash inflow divided by present value of cash outflow. Get the answer. Same thing you do it for other asset also. This is very, very straightforward question. Literally nothing. So though we don't have the exact question, but anything new here or ditto? Same, I mean, nothing new to learn from this question. Pretty straightforward. And now, this one is also straightforward. I'll quickly read it for you. Check. Shares of Ritik Limited presently traded at 64. That means what is this? Market price. Current market price. And company is expected to pay dividend of 6 rupees. Expected to pay dividend. Dividend paid is D0. Expected dividend is D1. So 6 rupees is D1. Growth rate 12%. G is given. That means I think we are using Gordon Chicha. It plans to raise fresh equity shares. We are planning to issue new equity shares. Sir, we already know if it is a new equity shares, first priority for NP will be issue price. IP missing? Market price. Now check. The merchant banker has suggested that an underpricing of 3 rupees is necessary for pricing new issue besides involving a cost of 1 per share for miscellaneous expense. So we have taken some merchant banker ka help to issue the share. He's saying don't issue the share at market price of 64. Reduce it by how much? 3 rupees. That will be better. That means issue price is 64 or 64 minus 3. 64 minus 3, how much? 61. Other than this, there is also 1 rupee miscellaneous expenditure.
Flotation.
You can treat it as a flotation cost. 1 rupee per share is flotation cost. Yes, Ajay. You need to find cost of equity shares. Cost of equity shares, how do you get? Got in such a formula. D1 divided by P0 minus flotation cost, whole thing added by growth rate. That's all, pure substitute. Only this underpricing and this miscellaneous expenditure is extra fitting. This miscellaneous expenditure, you can interpret it as flotation cost. 3 rupees undercutting means obviously you are not issuing it at market price, you are issuing it at 3 rupees lower. That's your answer. Okay. All right. This is similar. Same question we have. Indifference point. 2 plans ka. We may not have same value, but we have enough number of questions in our material about indifference point. No point. This is operating cycle. I don't know why I solved this. Okay. Sir, operating cycle, you know the formula, no? R plus W plus F plus D. And they're asking number of operating cycle in a year. How do you calculate number of operating cycle? 360. Here they're asking us to take 360. 360 divided by operating cycle 4.5. Again, this is a full faltu question. Waste. This one we will do. We don't have exact same question, but still easy only, but little different framing. Descriptive ka first question. One company DCF ka EBIT they have given. How much? 60 lakh. Fair enough. The company is evaluating option to introduce debt financing in its capital structure. Now currently they have only equity shares. Now they want to also bring in debt. Okay, some information they have given. Company has 4 options. Either to bring in debt for how much value? In option number 1, they'll bring debt for 60 lakh. The cost of the debt will be 10 and cost of equity in that case will be 12. Or they can bring how much debt? 75 lakh, where cost of debt will be 13, equity will become 15. Or they can go for 90, 105, respective cost and cost of debt, cost of equity given. Company operates on a zero tax regime. So tax rate is 0. Which option of debt financing in capital structure would you recommend as per the traditional approach? As per the traditional approach. Now traditional approach says debt is cheaper only up to, so net operating income said what? Use debt as much as possible because debt is very cheap. Go on using it. But what did traditional approach say? Though debt is cheaper source of finance, debt is not cheaper forever. It is only cheap up to a particular level. So use debt only up to that level. Beyond that, cost of debt will increase, cost of equity will increase, which will cause overall cost of capital to increase and value of the firm to reduce. That's what traditional approach said. Now, if you want to do the selection rule, or even if you don't remember traditional approach, no problem. Simple selection rule. In capital structure, chapter number 5, which we covered, what was the overall objective? Overall KO should be minimum and value of the firm should be maximum. That's the overall objective of capital structure. Yes, no? So basically for each option, you need to find KO and you need to find value of the firm. Select that option where KO is minimum and value of the firm is maximum. Done now. Fine, people. Now think on these lines. How do you find value of the firm? EBIT by KO. KO you don't know. KO you do? You don't know. Sir, we can find no, sir. Sir, equity ka value given or missing? Missing. If they had given equity ka value, debt ka value you already know, 60 lakh. Even if equity ka value was given, we could have found out the weightage and multiplied and got the answer in one liner. So here that is not there. Now another formula. How do you get value of the firm? S plus D. S plus D. To get SO, we need what? Net income divided by cost of equity. Cost of equity is given. EBIT is given. From EBIT we can find net income. That way we will be able to find S. Once you know S plus D you do, you get market value of the firm. That approach. Okay, Naji? First we will find what? Ish. EBIT is there. How much? How many options we have here? 4. So let's call out that we have 4 options. EBIT in all case will be how much? 60 lakh. We have EBIT, but we need EISH. How do you get EISH people from EBIT? Reduce interest. So take a calculator. In first option, how much debt to? 60 lakh. Multiply 10%. Sir, you should not multiply 10%, sir. This is cost of debt, sir. We need interest rate, sir. Zero tax regime. When there is no tax rate, cost of debt, interest rate will be same. Okay, now you're thinking good, but here it's not relevant. Fine, now. So 60 lakh ka 10%. How much interest? 6 lakh. 75 lakh ka 13%. 9 lakh 75. Correct. Like that, you will calculate the interest. Third ka what is the interest? 90 lakh ka 14%. 105 lakh ka 14%. How much you getting? 1260 and 1470. Yes, sir, people. From EBIT, reduce interest. You will get earnings before tax. Since tax is not there, earnings before tax, earnings after tax will be same. Since preference shares is not there, EISH also will be same. How much EISH? This is your net income or EISH. Do you know cost of equity under each option? Yeah, given. Each option ko cost of equity they have given here. 12, 15, 16, 16. Copy that. 12, 15, 16, 16. If you know net income and if you know cost of equity, can't we find out S? How do you find S? Net income or EISH divided by cost of equity. Divide this. 54 lakh divided by 12%. How much? 54 lakh divided by 0.12. 4 crore 50 lakh or 450 lakh. 50 lakh 25,000 divided by 15%. 335 lakhs or 3 crore 35 lakhs. These two ka division should get you those numbers. Fine. Now, what is this? S. Do you already know debt? D they have already given in the question. 60, 75, 90 and 105. Copy. 60, 75, 90 and 105. How do you get value of the firm now? V is equal to S plus D. These two you add, all this you add, you will get the value of the firm. Done, na, Sarji? So first case, mein value of the firm is 5 crore 10 lakh. Now people, if you know EBIT and if you know V, can't you find out KO? EBIT is there here. Value of the firm you know. Sir, what is the first formula to find value of the firm? EBIT divided by KO. If you know value of the firm, if you know EBIT, can't you find KO? Or if you want to rephrase this formula, you'll write what? KO is equal to EBIT divided by V. Yes, no, EBIT divided by V. Do EBIT is 60 lakh, V is 5 crore 10 lakh. 60 by 510 you do. 60 lakh divided by 510 lakh. How much? You'll get it in decimal, multiply by 100. You should get 11.76. 60 lakh divided by 4 crore 10 lakh into 100. 14.63. 60 lakh divided by 3 crore 88 lakh 12,500. You should get 15.46. Sorted, sir. Everybody, yes. Finally, you tell me which option will you go for? What is the overall objective? Value should be maximum. KO should be minimum. Where is the value maximum? This is the value. Where is the value maximum? This option. Where is KO minimum? Among all this, which is the minimum number? Obviously, it will not give contradictory result. It will be same. So, you will go for which option? Option number 1, where how much debt you will raise? You will raise a debt of 60 lakh. That's what you have to write. Go for option number 1. As value is maximum, KO is minimum. That's all is this question. Easy, but I think we had not seen this question till now. So, in a way, good framing. I'm waiting for you to process anything. If you're processed means next. Okay. Congratulations. Now onwards, Ella NR. NR means not required. Same question is there in leverage. 150, 180. Percentage change in EPS. Same. Ditto question is there. It's a study material question. Copy paste. This is again, I think, ratio question. It is same. It is there. There's nothing new in this. This also we have done in class only. It's a RTP question. We have done this in class. It's a RTP question. We have done it in class. It is there in our class notes only. We have covered this. This is again repeat. This one is also same. Repeat. Nothing new in this. Okay. All these are repeat. This is also same. One extra fitting they brought in. Because of that, maybe I will do question number 3B. Read the question. Vista Limited का retained earnings per share, dividend अला, retained earnings per share for the year ending is 3.60, and they told this is 40%. I means 40% we are retaining, means 60. This is your B, retention ratio. How much are we paying? 60%. Sir, that means can we find dividend? You can work out multiple way. So 3.60, 3.60 is per share of retained earning. This represents 100% or 40%. That means EPS will be 100%, no? Because of EPS, 40% you are retaining, 60% you are distributing. So for 100%, how much? So how much will be your EPS? 3.6 into 100 divided by 40. How much, people? 9 rupees. From this, can't you find out dividend per share? 40% if you are retaining means how much you are paying? 60%, which is 5.4. One approach. Or you can do it directly. 3.6 is on which platform? 40% platform. We want dividend. No, dividend is on 40% platform or 60%. 3.6 is for 40 means for 60 how much? 5.4. This is easy. Either first if you want you can find EPS and from that dividend, or directly use this only and prorate and get the dividend, whichever you are comfortable with. Okay na Sarji? Now this is the current data, no? I mean this is D1 or D0. This much is remaining. After paying dividend, this much is remaining. So this is D0. Okay, now onwards, same question. Check. Company is foreseeing a growth rate of 10% for the next 2 years. After that, growth rate will stabilize at 8% for how many years? Infinite. Which model? Dividend discount model or intrinsic value per share? We have solved the question as with 4 years. Here they have given 2 years. But in our problem, dividend paid was given. Here, retained earnings is given. From retained earnings, if you get the dividend, remaining part of the question is ditto, nothing change. Company will maintain existing payout ratio. If investors expect a return of 15%, here there's nothing but your cost of equity. Calculate intrinsic value of the share using dividend discount model. First, find the dividend through the proportionate. How much is that? 5.4. You can use the formula. If you want formula, what is the formula? D1 divided by 1 plus cost of equity whole power n. Here people, dividend is constant forever. Up to how many years it's a constant? 2 years. After that, it will grow at a 8% rate for infinite period. That means we'll have to stop our calculation at 4th year or 2nd year. So plus formula will be D2 divided by 1 plus cost of equity whole power 2. Correct? Then this is, by doing this, what are we going to get? Present value of expected dividend. How do you get intrinsic value? It's an addition of two present value. Present value of expected dividend plus present value of expected price. How do you get expected price? You know the formula. If you want P0, you will take D1 divided by KE minus G. Now we want price at the end of 2nd year. We want price at the end of 2nd year. If you want P2, you will take D3 divided by KE minus G. So that means your formula will be what? D3 divided by KE minus G. By doing this, what are you going to get? Price at the end of 2nd year, right? But this is current price or future price? That means you'll have to, this is the price at the end of 2nd year. You want its present value means multiply discount factor. What is the discount factor? 1 plus KE whole power 3 or 2 only? 2nd year discount factor. So if you want directly, you can substitute in formula and get. That's what ICA is solved. Okay. But, or you can go for our approach, which is table approach. I have solved table in the solution. They have used this. Your call. Done. Just how much is the dividend already paid? 5.4. For first 2 years, how much will dividend grow? 10%. So 5.4 plus 10%. So next year dividend will be 5.94. Year 2 ka will be 5.94 plus 10%, 6.534. Both these are future dividend. Multiply discount factor at 15%. You will get the expected dividend. Then find out the price of the share. But when you're finding the price of the share, P2 is equal to what? D3 divided by K minus G. Now to find D3, will you take this number and add 10%? No, from 3rd year onwards, growth rate will be 8%. Take this number and add 8% because 3rd year onwards, growth rate is 8. That's what I've written. Now substitute, you will get the price of the share. Multiply discount factor, you will get the present value of the share. present value of expected dividend plus present value of the expected share will give you intrinsic value. In fact, this portion, this whole portion, nothing new. The only portion new was they had not given dividend, but rather they had given retained earnings. From retained earnings, first we have to find out the current dividend which is already paid. Then onwards, do your normal calculation of dividend discount model. Congratulations, people. That's pretty much with respect to mock paper number 2. Thank you. Just now a few things, maybe 1 or 2 minutes I'll just spend with you. I know that you are already tired, so I'll not take too much time. Your pen only stopped writing. No, it's writing. Hello, people. To the best of my ability, I would say that I've tried to cover as much as possible in these 3 days. So thank you for coming on time, and thank you for being till the end. I know it was tough, definitely not so easy, because marathon sessions are mostly one-way traffic where I speak and you listen. So I'm sure it is tough, but you still kind of managed to sit through for the whole session from the day 1 till day 3. So I'm happy. So I'm really happy that I made that journey from Bangalore to Coimbatore. I'm sure I'll make more journeys in the coming future. I really liked it. So yeah, sorry Bangalore audience, Coimbatore. Yeah, all right. So yeah, so yes, I'm thinking to do it in Chennai and Hyderabad and these places now than in Bangalore, because classes, though, I prefer to take it in Bangalore because of the long durations. So at least marathon, I try to do it in other cities as much as possible. So now that's one part of it. So use this marathon. It will be uploaded on YouTube along with RTPs and MTPs. So you can always revisit. There will be some questions where you may have to revisit and check on this again. Okay. But that anyways is a subject related part. So I would not like to spend too much on the subject part. I'm just going to tell you some general guidelines which I personally followed, which I feel it might help you. One, people, self-confidence. I'm always a big on that. Whether you're prepared for 10 days, whether you're prepared for 20 days, or whether you're preparing for 1 year, it doesn't matter, right? Unless you believe that you can make something, unless you believe that you can crack the examination, it will never happen. Like now also, I think there was yesterday one person, since yesterday someone wanted to meet me. He finally came and met me now. You know what his things was? He said, sir, I have 8 days for advanced accounting. I've not touched, because he said apparently he was preoccupied with tax and law. He was scared of tax, so he wanted to give more time on the tax. So he's saying this time, he said, tax and law, I'll get exemption. I'm 100% sure on that. I like that confidence. Accounts, he said, I only have 8 days. What do? I don't want to skip the attempt. And I like that sentence very much. Because many people would say, if I've not even touched accounts, only if 8 days is there, then it is better to skip the attempt and write it in the next. And this guy is saying 2 papers may I'll score exemption. I mean, he seems to be a good chap. I mean, in terms of the smartness and things like that, I think he's expecting good marks, right? But I like the attitude that he was not willing to give up and he was still trying to meet and see what best can be done. So, right? So that's the attitude personally I feel each one of us should inculcate. Ability of not giving up, fighting till the end, right? Because it's very, very easy. See, when your preparations doesn't go your way, or when your plan doesn't go your way, it's very easy to say, fine people, another 3 months may I'll get another attempt, let me push it. But according to me, that pushing attitude, kind of brings you down. Because once you make that as a habit, if not this attempt, I'll write next attempt, then every attempt you will start giving the same excuses. And you'll say, okay, after 3 months. Later on, what happens when fine day? Because CA is not the end of the journey, it is just the beginning. Getting a degree of CA is just the start of your corporate life. So in this journey only, if you are wanting to look for shortcuts, so that's pushing things, after CA, what you will do? How you will manage? Because some of you will be opening your own consultancy business, practice and all that. There you can't do shortcuts. You will have to find your own way. So hence, as much as possible, hang in there, do it, give your best, right? It's worth. Sometimes even that 7 days, 8 days can be good enough to crack an examination. You never know our Vastu. No. Seriously, we don't know. And there is MCQ question in the pattern, people. Do not forget that. 30 marks is MCQ. Jai Allah, Jesus, Shiva, select one, no. Who knows? If you don't know, definitely answer one. There is no negative, bro. Who knows if it is right, oh? If it is right, 30 on 30 in MCQ. Wow, that is a sight. Lots of good karmas in your life you have done. Right? It can happen because one among the four is right option. There is a 25% chance of getting right. In descriptive, if you don't know anything, there is a 0% chance of getting right. Here in MCQ, there is a 25% odds of one option may be right. It's possible. So always fight till the end, select it. Let's see what happens. Once you're signed up for an attempt, make sure that you complete that paper. Okay, that is one. Another part is in the last. I know that now we have only like 18 days, 20 days, or maybe a little lesser than that, right? Now, people, whatever plans you make, whatever study hours, if you're planning to wake up at 4 o'clock, by 3:50 you should be up. Not 4 o'clock. 5 to 10 minutes before you should be up. If you're planning to study till 2 o'clock at night, it should be a little more. It's now time to exceed your expectations than to undermine it. Now, don't worry. Don't think about how many hours should I study. It's not the time for that anymore, right? Basic rule is I need 6 hours sleep. I need 6 hours sleep, about 2-3 times for my personal hygiene, 2-3 hours there. Balance thing, utilize as much as possible for studies. And keep in mind, it is just a matter of another 18 to 20 days. Beyond that, nobody will ask you to study. At least 1 month till the results come out, you don't have to even really bother about studies much. If you do this 18-20 days ka preparations properly, after examination, that 1 month ka, you could say, result break, you can really enjoy. You can do what you want. If you have not written well, no, that guilt will always be there. I should have studied a little more. I should have done this a little more. Because of that guilt, you'll not be able to enjoy those breaks also. So let us not be in that category. Let's give ourselves the best so that we feel at the end of the day we are happy. Like here, marathon, I feel I've done the justice. This is the best I feel I could have done. Now, when I walk out of that door, I will not have any guilt feeling. Because I feel whatever best was possible from my end I've given, now I'll get a good night's sleep today. That's pretty much what I don't know whether I'm the best teacher or I'm better than somebody. That and all is not my point of view at all. Maybe somebody is better than me. Maybe I'm better than somebody. That's a different issue. But for me, in this particular batch, whatever I wanted to deliver, did I deliver it? That's pretty much the agenda. I feel that I've done it and I'm happy with that. Whether how much of this marathon helps you to crack the examination, I don't know. We have picked up a few questions. Hopefully, wishes and blushes is that same question comes so in paper, and finally, sometimes it happens. Sometimes it doesn't happen. So then, depending on someone, let's start depending on ourselves. So as much as possible, go through with it, right? Still hang in there. I'll not give you any study timetable and all that fancy things. You already made one. I'm sure you're following that. Continue to follow that. Another 18 days. Yes, that's pretty much it. After 18 days, I'm pretty sure if you just put in your best efforts, results will come to the extent of the efforts you put in. Okay, I mean, effort is all that counts in my books. If you put in the best of efforts in my books, you are a winner. If not this attempt, next attempt, the result has to come. There is just no other way. Okay, that I'm a firm believer in that. Okay, that is one. Another few things is just don't be totally one-way track towards studies. Move your body also a little bit, because sitting in one place for 14 hours, 15 hours can make your body also too much. It may not support you in the long run studies. So take some frequent breaks. Like maybe if every 1.5 hours or 2 hours, take a 5-10 minutes break, walk, go to the terrace, go to the park if you have that luxury of time. Be in the natural setup, get some sunlight, air, eat properly. Last thing you want is to eat some crazy things and fall sick on the examination day. So let's not go into that things and all. So eat a little well, even if you feel like, I want to eat a little more, because sometimes when we don't have anything to do, we hog. Because only thing we are doing in our life now is study. So especially when we see some things, we'll get tempted. So remember, if you put too much load on your body, then body will be like. So if you want your body to support, then you need to support your body. So eat well, eat right. Just another 18 days compromise. Sacrifice, if you want. Sacrifice is a strong word. I think a little bit of compromise we need to do in our life, because after all, you're not doing this, writing this exam for me, nor for your friends, nor for your parents. You're doing this for yourself. But look at the advantage or the opportunity you have. A CA ka result, your CA ka result, people, if you end up passing, I'm sure you will, right? But seeing that pass marks, your whole family will be happy. You have an opportunity to make everybody around you happiness, because people know that this is not so easy degree to acquire. You need to put in that efforts. So once people see that particular pass on your mask card, right, your parents, your teachers, you yourself, right, everybody will be super duper happy, and that will be an amazing memory to cherish. I'm pretty sure it's going to stay with you for many, many years. I still remember, like, the day we cracked our examination. Back then we didn't even have like smartphones and things like this, right? We didn't have much of desktop. We used to go to the cyber center, right? So we were like, we see the result, we're like, yeah. People like, what happened? We're all shouting there because we cracked, we were happy, right? But they could not understand what is going on. They probably thought the system went off. Yeah, but just saying. So we see a lot of things. You will see it, many people shedding the tears of joy. So it's immensely like pleasurable experience, right? So yeah, so give yourself that, right? Just put in the efforts. I'm pretty sure in about 18-20 days time, you will, I'm pretty sure I'll not see you at inter level anymore. I'll be seeing you on the final level. Okay, that's all I would say. Just the general things. Keep yourself calm. That's all I would say, right? It's okay. I know that little bit stress and anxiety will be there, right? No matter, that little bit of fear might be there. Whether have I prepared enough? Will I remember enough? So those sort of anxiety is something till the last moment, till the time you go to the examination hall, that will be there. But don't dwell on that too much. Don't keep thinking on that only. If you feel you're anxious, tell yourself, okay, another 5 minutes, I will be anxious. Okay, let me be anxious. 5 minutes time. After 5 minutes, get back again to studies. So always come back. Whenever negative feelings comes, give a time to it. 5 to 10 minutes, let me wonder about that. After that, I'm coming back to studies. Priority should be just at this point of time fully on the studies. After that, there will be some point of time where you don't have to touch books. You can do whatever the hell that you are planning to do. Okay, sir? So yes, keep yourself calm. I'm pretty sure all of you will come out as winners, and I will see you you telling me that you have cracked this level with a happy news. I look forward to hearing you. If you want to connect back, I'm not there on social media. You can connect on LinkedIn is probably the only thing that I use. You can reach out to me on that. Happy to hear you on that. Okay. So thank you so much, people, wonderful people, for making your time and having that patience to sit through this whole session. Hopefully the session was helpful to you, right? So I'll see you soon on the other side at CA final level. Take care. See you. Bye-bye.